Hey guys, welcome back to the channel. This video marks the beginning of a new course completely free of cost, exclusively on the concept and application of price action trading. The course is designed in an orderly manner from the very basic to the advanced level as we move up the ladder. I have accumulated a good chunk of the information from some of the best trading books, trading blogs, paid courses of some of the famous professional traders, and a few relevant online sites. Also, I have taken a lot of effort to explain each concept in a way that even newbie traders can understand without much difficulty. So, I heartily welcome every aspiring trader to take a ride with me throughout this course. So, let's get started. At the heart and soul of it, the stock market is all about buying and selling, demand and supply. Sometimes we buy a stock and sometimes we sell one. But just by buying and selling based on our instincts will not do any good for our trading account. Chances are we end up in losses, and a worst case scenario, we blow up our trading account. That is why almost all the traders try to find an edge in the market to remain profitable. Depending on the type of trader you are, you can choose between technical analysis, fundamental analysis, quantitative analysis, and finally, price action analysis. The technical analysis primarily involves using different categories of indicators to predict the future price movements. Fundamental analysis, on the other hand, relies on the fundamentals of the stock or the company, primarily focusing on the financials, earnings, etc., to make a trade decision. Similarly, quantitative analysis utilizes the use of statistical tools to analyze the market data. But if you talk about technical analysis in particular, which is followed by majority of traders, the interesting thing that can be identified is that the indicators used for the analysis are derived from some of the fundamental inputs of the market, namely the price and the volume. Think about it for a while. Which is better, a fruit from our own home farm or one with a heavy pesticide usage? The former may not be very good looking and won't stay fresh for many days, but it's healthy, while the latter may look appealing to the eyes and stays fresh longer, but it's not even remotely good for our health. Likewise, too many indicators for our trading is not very good for our trading account. This is because the indicators are a result of so many intermediate processing of the basic price and volume, so that the pure behavior of price and volume are lost. And at the end of the day, you make your own conclusion without listening to what the market has to say. I'm not in any way concluding that technical analysis is not good or that the indicators are retarded. Instead, what we have to understand is that we have with us a gold mine by the name of price, which, if studied properly, can help us identify what the market is doing. This study of price and its behavior is known as price action. So, unlike indicators, fundamentals, or algorithm, price action tells you what the market is doing and not what you think the market should do. The price action focuses mainly on the recent and current prices. It is also dependent on the overall market trend and finally on the price structure of the market. We will talk about each one of them in our upcoming episodes. Now, price action is not the holy grail or the mantra for ultimate success in stock markets, because trading is mostly about your psychology and implementation, and not about a single special strategy. The goal for most traders is to maximize the trading profits through a style that is compatible with their personalities. Without that compatibility, I believe that it's virtually impossible to trade profitably for a long term. But if you devote a good amount of time to learning price action trading, you'll trade with cleaner charts without hell lot of indicators. You'll also be able to pinpoint your trade entries and exits with better precision. This video will focus on how the market price moves or how the prices are made to move in a particular way by some big players. You might have heard people saying things like history repeats itself, price memory, and stuff like that. What they really mean is how the market price moves in a specific pattern time and time again. Now the question is, why does the price of a stock go up or down? There can be different answers to this particular question. Like it could be the news or government passing some bill, a new monetary policy by the RBI, some legal issues, etc. But at the center of it all, the one thing that makes the market movements are the earnings of a company. Even if a piece of very bad news related to a particular stock has come out, but it has no direct impact on the earnings of the company, then there might be a temporary noise in the stock for a short period, but eventually the stock will recover. But on the other hand, stocks like Vodafone Idea, Yes Bank, etc. are victims of the news that directly affects the earnings of the stock and thus resulting in their crash. In the stock market, there are mainly two players in general. Number one are the retailers and number two are the institutions. 90% or more of all the trading in the markets is done by institutions, which means that the market is simply a collection of institutions. The institutions includes mutual fund houses, banks, brokerage houses, insurance companies, pension funds, hedge funds, etc. These companies account for most of the trade volume and they mostly trade on the fundamentals of the stock. But now they are eventually shifting to the algorithmic side of trading. What I mean to say is that the trading done by these institutions controls the direction of the market on daily and weekly charts. And a lot of the big intraday moves or swings are also controlled by the big institutions. It is not very surprising to know that almost all these institutions are profitable over time. So the institutions are generally considered to be the smart money, meaning they are smart enough to make a living by trading and they trade a very large volume every day. No trade can take place without one institution willing to take one side of the trade and the other willing to take the other side. The small volume trades made by the retailers can only take place if an institution is willing to take the same trade. Let me explain this. If you want to buy at a certain price, the market will not get to that price unless one or more institutions also want to buy at that price. Similarly, you cannot sell at any price unless one or more institutions are willing to sell there, because the market will only go to a price where the institutions are willing to buy and others are willing to sell. I hope the point is clear. Most individual traders or retailers have no ability to move the market. The market will only test a particular price if one or more institution believes that it is financially sound to sell at that price. On the other hand, there are other institutions which believes that it is profitable to buy there. So to be very precise, at every tick in the stock market, institutions are buying and other institutions are selling. And all of them have proven systems that will make money by placing those trades. So the main point to be noted, or the main point that I want to convey is this. You should always be trading in the direction of majority of the institution. Or like the professionals say, follow the footprints of these institutions because they control where the market is heading or simply they move the market. Now let us look at a new scenario. You have found out a new trading strategy that makes money and it works perfectly, but at some point it stops working after a while. Many of us might have gone through this situation. The reason for this is simple. The markets are changing. It is never fixed, but it is always in transition from one stage or one phase to the other. This simply means that if you are using a trend trading strategy today and you continue to do that, then at some point you will lose money in range markets. And similarly, if you are using a range trading strategy and continue using it for a while, at some point you will end up losing the money in the trending markets. The thing to understand is that the profitability of trading system moves in cycles. There are periods during which the trend following systems are highly successful and profitable. Then the market shifts from the trending to range price action. That is when all the trend trading systems becomes unprofitable and the inexperienced traders start making losses. This is the reason why you see a lot of newbie traders boasting up their P&L during the trending markets, while all of a sudden they disappear when the range market arrives. To sum it all up, market moves in 3 phases or 3 stages. Number 1 is the uptrend or the advancing stage. Number 2 is the downtrend or the declining stage. And number 3 is consolidation stage. So the consolidation stage can be further subdivided into accumulation phase and distribution phase. So let us look at how the market transitions from one phase to the other. Let us start with the accumulation phase. The accumulation phase is when the big institutions start buying a particular stock. These institutions deals in huge bulks of money. Therefore, their order sizes are expected to be huge. So think what happens if they buy such huge quantities in a single order. The prices would react suddenly and the prices would just shoot up. They will be able to purchase the stock at a specific price only if there is enough liquidity in the stock. Else, the orders will be matched at higher prices, which will in turn reduce the profitability of the institution. But they will not allow this to happen. So instead of placing a bulk order, the institution places small orders secretly. And this is called as position building. In short, we can conclude that during the accumulation phase, the institutions are building up the position slowly and silently. And during the accumulation phase, the market tends to be in a range or it is range bound. And the trend traders would face losses if they don't adapt suddenly. So how will you identify the accumulation phase? Generally, the accumulation phase occurs after the price has fallen down, or simply it happens after a downtrend. The accumulation phase can also be viewed as an area of low volatility or an area where there is a lack of interest between the bulls and the bears. Moving on to uptrend or the advancing phase. This stage occurs usually after the price breaks out of the accumulation phase. Here's what happens in the uptrend or the advancing phase. After building up the positions, the institutions take the market higher. So there is a bullish sentiment in the market all along. The institutions will not book profits anytime soon. So the uptrend can last anywhere from months to even years. It is during this phase that the trend traders make a lot of profit. We will discuss on how to identify an uptrend and how to approach your trades during an uptrend in our upcoming videos. But now let's move on to the third phase, which is the distribution phase. The distribution usually occurs after the prices have risen to a good extent, and the distribution phase looks similar to an accumulation phase where the market remains in a range. Here's what happens in the distribution phase. The institutions begins to distribute or sell or square off their positions after they have made a good chunk of profit on their initial investments. Similar to the accumulation phase, the institutions sells the shares secretly and slowly so that the market doesn't fall immediately, creating a panic situation. So they will sell at a range of target prices. And that is why the distribution phase is also range bound, and the trend traders don't stand a chance if they don't adapt suddenly. In the distribution phase, the volatility tends to be high due to the panic of an imminent crash or fall in the prices. The last and the final phase is the downtrend or the declining phase. The declining phase happens when the price breaks down of the distribution phase. During this phase, the selling pressure is high and the market outlook is bearish. Most traders try to cut their losses, and those who don't, well, they remain as long-term investors in the hope that the price will come back up. The volatility tends to be very high due to panic and fear in the market. So this is a good time for trend traders who can short the market and get hold of good profits. This is how the phases look like in a chart. And it is interesting to note that these stages continue to appear time and time again as cycles. And if you could spot them early, then you have an edge over the market, and eventually you can use a suitable strategy that works in the situation. We will talk about different trend trading and range trading strategies in detail in the upcoming videos, and we will also understand how to design your trading strategy according to changing market conditions. In this age of social media, we come across innumerable apps like TikTok, Instagram, etc., where the creators introduce a new idea every day, and some becomes so hyped and popular that others begin to perform the act. It becomes a trend, or the act is said to be trending. Even YouTube has a trending section that features the most popular videos at a specific time. This trend stays for a short duration, that is for a few days to a few weeks. So this is a short-term trend. Similarly, the stock markets also have trends that may range from short-term trends to medium-term trends to even long-term trends, depending on the duration which the trend persists in the market. So in the stock market scenario, a trend is the overall direction of the market during a specified period of time. In the stock market, there are mainly three types of trends. Number 1, the uptrend. Number 2, downtrend. And number 3, sideways trend. There are different methods to identify the general trend of the market, but the most popular ones are by using the trend lines for visualizing the price swings, and the other method includes the use of indicators like moving averages, average directional index, etc. But we will limit our discussion to only the first method. The simple reason being this is a price action course and we want to trade with cleaner charts and minimum confusion. Before moving on further, let me talk about a situation where there are 3 stock market participants: an investor, a swing trader, and an intraday trader. If I ask them what is the present market trend, do you think all of them will have the same answer? Not necessarily. Investor could say it's a bullish market, while the intraday trader would say it's bearish trend. Even the swing trader can say there is no trend at all or the market is sideways. What is the reason for different opinions? Why do different people have different views on the market trend given the same charts and same conditions at the same instance? The simple and straightforward answer is the time period that each trader used for their analysis. The investor might conduct his analysis on the monthly or yearly time frames, while the swing trader might be using the weekly or daily time frames. And for an intraday trader, the time frame might be 15 minutes or 5 minutes. Therefore, as the time frame changes, the analysis changes. So does the perspective on the market trends. So this is my first conclusion, that trends are relative in nature. That is, trends are dependent on time frames and it changes with time frames. There is a common saying in the market that trend is your friend. I will try to bring clarity as to why this statement is relevant for our trade success. In the last episode, we have talked about the 4 different phases or stages of the stock market price movement. Now let us analyze in detail how the price moves. For that, let's take an example of a rubber ball, for instance, and let's bounce the ball once. The ball would not just take off and go out to space, right? It will come back to the ground and bounce back up. Similarly, in the stock market also, the price does not move indefinitely up or down. There will be direction changes once in a while. This nature of price oscillation is called as price swings. A typical price swing will consist of an impulse move and a corrective move. The impulse move is the strong move with stronger price action candle, while the corrective moves in a trend are generally weak or dull moves opposite to the direction of impulse move. Moving on, let's understand this by taking up each of the trend types and learning how to draw the trend line for analysis. By definition, uptrends are marked by rising data points, such as higher swing highs and higher swing lows. So here the price moves up in such a way that the swings also move up, making a recognizable pattern. During an uptrend, the impulse move is a strong up move with a series of strong bullish candles which forms a higher price than the previously formed high. The impulse move is followed by a corrective move in the opposite direction of the prevailing bullish trend. The corrective move usually includes a lesser number of weaker candlesticks that forms a lower price, but this lower price is still higher than the previous lower price formed. The corrective moves are generally due to profit booking by some traders. As a rule of thumb, a trend can be confirmed as an uptrend only when the price has made at least 2 swings on the upside. After finding out all the higher lows, all we have to do is to draw a line connecting all the swing lows or the higher lows that we have plotted. This line connecting a series of higher lows, creating a support level for future price movement, is called as a trend line. It is from the vicinity of this trend line that future price movements would reverse or break out, and therefore it is a very important trading zone or an area of value. The trend line is an area from which we can trade the impulse swing moves, or simply we can place a buy order when the price reaches the trend line. After identifying all the higher highs, we can draw a line connecting the series of higher highs or swing highs that we have plotted, and this line is called as the trend channel line, which will act as an area of resistance for the prices, and we can trade the corrective moves from the trend channel line, or simply we can place a sell order when the price reaches the trend channel line. Coming to downtrends, by definition these are marked by falling data points such as lower swing lows and lower swing highs. In a downtrend, the price moves down in such a way that the swings also move down, making a recognizable pattern. So during a downtrend, the impulse move is strong in the downward direction with a series of strong bearish candlesticks which forms a lower price than the previously formed low. The impulse move is followed by corrective moves in the direction opposite to the prevailing bearish trend. The corrective move usually includes a lesser number of weaker or dull candlesticks that forms a higher price, but this higher price is still lower than the previous formed high. So the corrective move is generally due to profit booking by some traders who took a short trade earlier in the trend. So a trend can be confirmed as a downtrend only when the price has made at least 2 swings on the downside. That is, 2 impulse moves and 2 corrective moves should be there. Now after plotting all those lower high points, we can draw a trend line connecting all the swing highs or the lower highs that we have plotted. The trend line so formed acts as an area of resistance from which we can trade the impulse move to the downside, or simply we can place a sell order when the price reaches the trend line. As in the previous case, if we plot the lower lows and then draw a line connecting all these lower lows, we will get a trend channel line which will act as a support for the future prices. And it is from this trend channel line that we can place buy orders to trade the corrective move. So by now, you might have the realization that the corrective moves are weak moves opposite to the existing trend, while the impulse move happens in the direction of the trend and is generally a series of stronger candles. This is the reason why we should trade the impulse move during trending market so that the probability of profit is high. This is the reason why trend is your friend. As we move on, it is very important to understand when a trend will end and when the consolidation will start. This can be identified by the use of swing transition. During an uptrend, whenever the price breaks the higher low for the first time, then it is an indication that there is a transition in the uptrend. Similarly, when a price breaks the lower highs in a downtrend, it indicates in the transition from downtrend to a sideways trend or even an uptrend. The final type of trend is not actually a trend, but it is a situation where there is no clear trend in the market, where the market stays inside a range. We have talked about ranging stages of the market as accumulation phase and distribution phase. So the price movement between two price levels is called as sideways trends. There are three types of sideways trends. Number one is the range contraction. Number two is the range expansion. And the last one is the triangular range. Let's talk about range contraction first. During range contraction, the levels shrink and the price action becomes almost neutral or flat. This shows the lack of any interest between buyers and sellers. The volatility in the market also drops. So range contraction happens when there is a shortening of the price bars, or simply the candlestick sizes reduces. The high and low range or levels get narrower or closer to each other. And this is a strong indication that a trend reversal is coming soon. That is, if there was a prior downtrend, now the trend might change to an uptrend. But it is just an indication, it is not for sure. During a range expansion, as the name suggests, the levels will expand and the price action starts becoming visible. So range expansion is associated with lengthening of the price bar, or the size of the candlesticks becomes larger, and the high and low range or the levels gets wider. So range expansion usually indicates a continuation in the price pattern. That is, if there was a prior uptrend, it is an indication that the uptrend might continue in the future, but it is not for sure. Now the final type of sideways trend is the triangular range, where the price shrinks or expand not between two fixed horizontal levels, but rather an expanding or converging level. This is a topic which needs broader discussion, so we will talk about triangle patterns and how to trade them further forward in this course. Even though the trend lines do a good job of showing overall market direction, one issue with trend line is that they often need to be redrawn. For example, during an uptrend, the price may fall below the trend line. But this does not necessarily mean that the trend is over or there is a breakdown. The price may move below the trend line and then continue rising. So in such an event, we have to adapt ourselves and the trend line needs to be redrawn to reflect the new price action. Drawing the trend lines is easy, but there can be errors in drawing the trend line. So that is why just using trend lines exclusively to determine the trend is not really advised, because most professional traders also tend to look at other indicators like moving averages or average directional index to confirm the market trends, because the more the confirmations, the better the analysis. So it's finally time for the most important part of the video, that is identifying the strength of a trend. So generally trends can be categorized into two types depending on the strength. That is, there can be a strong trend or there can be a dull or weak trend. The main parameters to keep in mind while categorizing the trends based on their strength includes a few parameters. Number one is at least two or more swings has to be there, or there should be two or more points of contact in the trend line. Then only a trend is considered to be valid. Number two is the slope. So the slope of a trend indicates how much the price should move each day. So steeper the slope, the better the trend. The slope is simply the angle between the critical price level during a consolidation and the trend line. So if it was an accumulation phase and the price breaks out to an uptrend, if we take the angle between the trend line and the top price level of the accumulation phase, then we can easily find out the slope of the trend. So if the trend is too flat, strength is considered to be weak or dull. The third parameter is the time of the trend. It is actually about the time required to form a trend. If the trend took months to form, then it is considered to be more stronger than a trend which took just weeks or days to form. So more the time a trend takes to form, the more stronger it is. We can also categorize the trend based on the duration, like it could be a short-term trend, an intermediate trend, or a long-term trend. The longer the trend remains, the stronger it is. So these are a few parameters to identify the strength or the weightage of a particular trend. In this video, you will learn how to read candlestick patterns like a professional trader. This is even if you have no experience with candlestick patterns beforehand. And here's the good thing, I will explain a simple method to read the candlestick patterns without memorizing a single pattern. That's right, you don't need to by heart any of these patterns. So let's get started. Candlesticks are a way to show the market prices of a security on your chart. It's not the only way to represent it. We have other ways of plotting them like bar chart, line chart, etc. But the candlesticks are one of the more popular approaches. The candlestick usually consists of two parts, a real body and shadows or wicks. Also, when you're dealing with candlesticks, you must be aware that there is a 4 price point for every candle on the chart. These price points are the opening price, the high price, the low price, and the closing price for the same period, or simply we call them as OHLC. The real body of the candlestick shows the open and close prices, while the shadows on the top and the bottom of the body shows the high and low prices for that particular period. The shadows looks like wicks and hence they are called as candlesticks. The upper wick signifies the high of the period and the lower wick signifies the low of the period. The high is the highest price point of the candle at a particular time and the low is the lower price point of the candle at a particular time depending upon the time frame you are trading on. Candlesticks generally have two popular colors, green and red. Sometimes it might be white and black depending on the settings that you use. But most commonly it's green and red. And a very important feature is that for green and red bars or candles, their opening and closing prices are at different locations. The color of the body of the candlesticks determines if the candlestick is showing a bullish or bearish price movement. That is, if the opening price is less than the closing price, then the body of the candlestick is green or white. Similarly, if the opening price is more than the closing price, then the body of the candlestick is red or black. The longer the real body, the more bullish or bearish the candle is. There are so many candlestick patterns out there, ranging from engulfing candlesticks, shooting stars, hammers, spinning tops, dojis, etc. to name a very few. So if you were to learn all these patterns, it would seem very hard and confusing. But don't worry, because we have got an easy way to understand what each candlestick means and identify the strength or priority of each of them. To learn this method, all you have to understand is just two little things. Number one is the open, high, low, close, or the OHLC of the candles. And number two is to figure out who is more dominant in the market, whether it is the bulls or the bears, or simply the buyers or the sellers at a particular time period. Let's start our discussion on the first category of candlesticks. These candlesticks are called as marbosus. Let's look at the first type. Since the candle is a green one, it is a bullish candle. It has a big real body but has no wicks or shadows on either the upper or the lower end. So we know that the longer the real body, the more bullish the candle is. The OHLC of the candle is as follows. Since it is a bullish candle, the buyers are under control, so the closing price is greater or higher than the opening price. Since there are no wicks on either side, the high and low prices coincides with the close and open prices respectively. As a rule of thumb, the wick of a candle indicates price rejection or opposition by the opposite party. In case of a bullish Marubozu, the open and low prices coincides, and similarly the high and close price coincides, which means that there is no selling pressure from the bears. That brings us to the conclusion that bullish Marubozus are the strongest bullish candles we can find on a chart. But we have to be very flexible with patterns. That is, we have to first quantify and verify, because in the market the patterns generally don't occur exclusively the same way as it is mentioned in those textbooks. So let's look at this green candlestick pattern where the price has closed higher for the period. It has opened lower and closed higher, which means it is a bullish candlestick, and there is a small lower wick and a small upper wick. But the high and low prices are so close to the open and close prices, which means there is a very weak selling pressure from the bears. So in real market conditions, we can actually consider these candles as bullish Marubozus, because even though there was a slight selling pressure, it is still a strong bullish candle. Now moving on to bearish Marubozu, which is similar to the bullish Marubozus, but this pattern is a strongest bearish pattern. For a bearish candle, the open prices are higher than the closing prices. This is because the sellers are willing to sell at all the available prices. A bearish Marubozu also indicates that there is so much selling pressure in that the participants actually sold at every price point during the day, so much so that the stock closed near the low point of the day. In case of a bearish Marubozu, the high price and the open price coincides, while the low and closing prices coincides. The candle has a big real body with no wicks on either end, indicating a strong selling and a complete lack of buying or opposition from the bulls. As mentioned earlier, we can be a little bit flexible when trading in real markets. Now let's look at the second category of candlesticks, the pin bars. The first category of pin bars are the hammers and hanging man. Talking about hammers, a pin bar is said to be a hammer when it appears at the bottom of a downtrend. The hammer consists of a small real body at the upper end of the trading range with a long lower shadow. The longer the lower shadow, the more bullish the pattern is. Generally, the prior trend for a hammer should be a downtrend as mentioned. We should visualize the hammer pattern in the following manner. The market is in a downtrend. So bears are in absolute control over the markets. When a hammer forms, the price goes even lower and it forms a new low price. The price action of hammer formation indicates that the bulls attempted to break the prices from falling further down, which simply means that the bears tried to bring the market lower, but they did not succeed in their attempt to do so because the bulls generated a lot of buying pressure, so much so that the price closed near the open of the candle. This action by the bulls has a potential to change the sentiment in the stock. So we can say that hammer is a reversal pattern, and a hammer pattern could indicate a bullish reversal in the market. Now moving on to the hanging man. A pin bar is said to be a hanging man when it appears at the top of a trend. Similar to the hammer pattern, the hanging man is also a reversal pattern, except the fact that it is a bearish reversal pattern. A hanging man signals the market high. Here's how you should visualize the hanging man pattern. The market is in an uptrend, hence the bulls are in absolute control over the market. A hanging man at the top of the trend indicates that the bears have managed to make an entry. This is emphasized by the long lower shadow of the hanging man, which signifies that bears have tried to break the stronghold of the bulls, because the bulls tried to push the prices higher, but the bears managed to bring in so much selling pressure that the price closed closer to the open price, creating a small real body. And there is a high probability that the market trend would reverse, and the hanging man pattern is a good indication that bearish sentiment is about to prevail in the market, and it is a good time to short the stocks. Now the second category of pin bars goes by the name of shooting stars or inverted hammers depending on where it is formed on the chart. Talking about an inverted hammer generally occurs at the end of a downtrend. This is the weakest bullish candle that you can find in the market. We can see that the range of the candle or the real body is very small. Also, the open and closing prices are close to each other. The long wick suggests that the bulls tried to take the price higher, but there was a big selling pressure by the bears. So it indicates that the weak buyers are in control of the market and there can be a shift in the sentiment. So we can say that even though a green candle was formed, the sellers are actually in control of the market. The inverted hammer is generally accepted as a price reversal candlestick pattern, just like the hammer, where the trend shifts from a downtrend to an uptrend. But if you were to ask me which signal would you trade, the hammer or the inverted hammer, I would definitely go for the hammer pattern, because the hammer pattern gives a much stronger indication of a trend reversal than an inverted hammer pattern. This is also due to the difference in selling pressures in both these cases. Now moving on, a pin bar is said to be a shooting star when it occurs at the end of an uptrend, indicating a price reversal. Similar to an inverted hammer, it also has a real body with the open and close prices close to one another. It also has a large wick on the upside, indicating that the bulls tried to bring the price up, but they were overpowered by the bears who pushed the price below the open price. So the shooting star is a strong bearish pattern. It is stronger than the hanging man pattern that is formed in the uptrend. This is because the sellers were more in control when the shooting star was formed rather than during a hanging man pattern. Now let's move to the third category of candlesticks. We can clearly see that the candles have a small real body. A small real body indicates the open and close prices are quite close, as we have discussed so far. The upper and the lower shadows are almost equal in length. Since the open and close prices are close to one another, the color of the candle doesn't really matter. Now talking about the upper shadow, the presence of the upper shadow tells us that the bulls did make an attempt to take the market higher. However, they were not successful in their attempt. If bulls were truly successful, then the real body would have been a long green candle as seen before in case of Marbosus. Hence, this can be treated as an attempt by bulls to take the market higher, but they were not successful at it. Similarly, the presence of lower shadow tells us that the bears did attempt to take the market lower. However, they were not successful in their effort. If they were really successful, then the real body would have been a long red candle as in case of a bearish Marubosu. Hence, the bears' attempt to take the market lower can also be treated as an attempt which was not successful. So here, neither the bulls nor the bears could establish an influence or a superiority in the market, which is evident from the small real body. What this means is that there is an indecision between bulls and bears. They are not able to clearly influence the market direction. So this type of candlesticks is called as spinning tops, which are actually indecision candlesticks. Now let us consider two situations where spinning tops can be formed, and let us discuss what the outcomes are. Now what if the spinning tops were to occur in a downtrend? So during a downtrend, the bears are in absolute control as they are able to take the prices lower. A spinning top in the downtrend indicates that the bears could be consolidating their position before resuming the trend. It can also be seen as an attempt by the bulls to arrest any further price fall. But are they really successful? Because if the bulls were to be really successful, it would have resulted in a strong bullish candle rather than a spinning top. So clearly there are two foreseeable situations or outcomes with equal probability in this case. Number one, either there will be another round of selling and the market will continue with its slow. Or number two, the markets could reverse its directions and the prices would increase. As a trader, you need to be prepared for both the situations. That is for either a reversal or a continuation. An obvious situation persists in the uptrend also. Now lastly, let's talk about the dojis. So dojis are similar to spinning tops, except that it does not have a real body. This means the open and closing prices are equal. So doji is an important candlestick pattern as it provides very crucial information regarding the market sentiment. By a textbook definition, doji suggests that the open price should be equal to the close price, which indicates that the real body does not exist. The upper and the lower wicks can be of any length, and the color of the candle does not really matter because the prices are very close to each other. The dojis have similar implications as spinning tops as we have discussed just now. So whatever we have learned from spinning tops applies to dojis as well. So doji also conveys indecision in the market, meaning that the bulls and bears are confused whether to take a trade. Both dojis and spinning tops ask the trader to remain cautious in the market. There are a lot of other candlesticks, but those mentioned so far is enough to understand the idea of similar candlesticks that forms in the chart. Now let us arrange the candlesticks from strongest to the weakest. So first of all, we'll consider the bullish candles and arrange them in the order of their strength. Moving on, let us arrange the bearish candlesticks in the order of their strength from strongest to weakest. A gentle reminder at the end of the video would be not to trade these candlesticks in isolation, because more the confirmations, the better. The key thing that I am trying to bring across is that you understand what each individual candlestick pattern means, and afterwards you can use these tools and techniques that you have learned and make it a part of your trading plan when you consider different elements of price action, which we are going to learn in the upcoming episodes of this training. In today's episode, our discussion will focus on one of the hot topics in this price action course. The simple reason being, this topic is what helps a price action trader identify the critical price levels and decide with the entry targets and stop losses. The support and resistance are one of the key factors that distinguish between your success and failure in trading. Starting off, the support and resistance are specific price points on a chart, which is expected to attract maximum amount of either buying or selling. The support price is a price at which one expects more number of buyers than sellers. Likewise, the resistance is a price at which one expects more sellers than buyers. So as the name suggests, the resistance is something that stops the price from rising further. This is a textbook definition that you can find in any standard trading book. Let's dig deeper into this topic. Let us understand why some price points behave in this particular manner. We have talked about the fact that stock market runs on demand and supply. This very concept is what causes some price levels to behave as a barrier or some as a booster for the prices. Take an example of a stock trading at 125 rupees. Let us say that an institution thinks that the stock will do good in the upcoming quarters, but the fair price is 100 rupees and not 125 rupees. In order to achieve the fair price, they take the market down to 100 rupees, where they slowly and steadily build their positions. The price seems to respect the price level of 100 rupees. This level where the demand for the stock is met and from where the prices will start to rise is called as the support level. The support level can also be seen as a price level which holds the prices from falling further down. It is also an area where the big buyers will buy the stock. Due to a large number of buy orders at the support level and the lack of sellers to match all the orders, the price starts rising from the support level. A price level is said to be a support level when it is below the current market price. Now moving on with the same example, the price rallied from 100 rupees to 200 rupees in a matter of months. This is when the institution thinks of squaring off their position or selling the stock to make a profit. They do this by placing a large number of small sell orders so that the supply meets the demand. Or in other words, they ensure that there are enough buy orders at the same price at which they want to sell so that the profits are not reduced. This particular price level will look like it is stopping the prices from moving further up. So this level is known as the resistance level. The number of sell orders in this price level is higher than the number of buy orders, or the supply is higher than the demand, due to which the prices start to fall from this level. A price level is said to be a resistance level when it is above the current market price. As a trader working in any time frame, it is important to figure out the critical levels where there was some price action. By identifying the important price levels, you can make more successful trades using the price action technique. Let us learn how to draw supports and resistance in our chart by a simple 4-step process. In short, these 4 steps are loading the data points and zooming out, identifying the obvious price action zones, aligning the zones, and fitting a horizontal line. Now we can take a look at each of them. Step 1 is to load the data points and zoom out. After selecting your preferred time period for the trades, you want to zoom out your charts. This is because we want to see the bigger picture. Once you can see the big picture, it is much more obvious to your eyes which key levels should you be paying attention to. So if your objective is to identify the short-term support and resistance for intraday trading, then you must load at least 3 to 6 months of data points. And if you want to identify the long-term support and resistance for swing or positional trades, load at least 12 to 18 months of data points. So when you load more number of data points, the chart looks more compressed. Moving on to the second step, we have to identify the obvious price action zones. A price action zone can be described as sticky points on this chart. This is because the level sticks out or is easily visible to your naked eyes. So if the level sticks out, the level matters or it is a level of importance. But if you are doubting your eyes and asking if it is a level or not, then it's better to ignore it because it is not an important level. Just to give you better clarity, you can identify a critical level when the price has displayed at least one of the following behaviors. That is, number 1, the price hesitates to move up further after a brief up move. And number 2, the price hesitates to move down further after a brief down move. And finally, number 3, when sharp reversals occurs at a particular price point. These are some of the ways you can figure out the price action zones. Now moving on to step number 3, aligning the price action zones. Now when you look at a 12 to 18 month chart, it is very common to spot many price action zones by the method that we have just discussed. But we don't have to track down all these price levels. The trick is to identify at least 3 price action zones at the same price level. But a critical point to note while identifying these price action zones is to make sure that these price zones are well spaced in time, meaning there should be a good time difference between the 2 levels spotted. The more the distance between the 2 price action zones, the more powerful the support resistance identification, or we can say the support or resistance is a major price level. Now after identifying and aligning your price action zones, we move on to the step number 4, that is fitting a horizontal line. Connect the price action zones that we have identified with the horizontal line. After drawing the line, you have to adjust your level to get the maximum number of touches. The more touches, the better, because the more number of touches, the stronger the price level will act as a major support or resistance. So how do you tell that you have drawn a support or you have drawn a resistance? As we have discussed, if the market price stays above the level that we have drawn, it acts as a support. Similarly, if the market price is below the level that we have drawn, then it will act as a resistance. Here's an important mistake that most traders make while plotting the support resistance levels: the approximation risk. Generally, when identifying the support resistance, you run into approximation risk. The thing to understand is that the market will not respect just a single price level, but rather a group of corresponding price levels or an area of prices. So hence, we have to give a room for error, which means that the price level should be depicted in a range and not just as a single price point, which simply means that rather than drawing a single line to plot the support resistance, we should represent it as a zone or an area where there is a price action happening. So this is a very important idea to remember when you are placing the targets and stop losses while trading the support resistance levels, especially if you are keeping stop losses with respect to a single support or resistance line. You might end up hitting your stop losses often. Let us talk briefly about how reliable the support resistance are. The support and resistance lines are only indicative of possible price reversals. That is, by no means we can be certain that a reversal is going to happen, which implies that the support and resistance alone are not the holy grail to success in price action trading. Rather, a few optimization techniques will help us identify high quality trades. Remember the fact that when you see quality, the quantity will always be compromised, but this compromise is worth taking. The idea is to identify quality trading signals as opposed to identifying plenty of worthless trades and ending up bursting your pockets. This leads to an important idea. So what if we have a checklist or a framework for every trade that we consider? The checklist would act as a guiding principle before we initiate the trade. The trade should comply with the conditions specified in the checklist. If it does, we take the trade. Else, we drop it and look for another trade opportunity that complies with the checklist. Not only that, we should not make a habit of just trading with a single confirmation. That is, if the price reaches a support or resistance, we should not jump into the conclusion that the price would reverse the direction and we should enter the trade. It does not work like that. Instead, what we should do is that we should look for confirmations. In the previous episode, we have talked about price action candles, which are very important. It is generally a very good idea to use some of these price action candles along with the supports and resistance to actually make a trading system. That is a confluence trading system, which is much more efficient than using a single indication or a single confirmation. So make your own system and create a checklist, because the checklist has another advantage. It helps you to be disciplined, because discipline, as they say, makes up 80% of the trader's success. So in my opinion, the checklist forces you to be disciplined. It will also help you to avoid taking an abrupt and reckless trading decision. So we will continue this discussion on support resistance in the upcoming episodes, because it is an extensive topic requiring a deeper understanding. In the previous episode, we have discussed the basic stuff regarding supports and resistances. In this video, we will go a step further, seeking the depths of support and resistance levels. We will talk about how to identify if a level will break or not, how to approach our trades using supports and resistances, that is, if we should trade a breakout or should we trade a reversal. And finally, we will learn to find trades that other traders fail to notice. Let's get started right away without wasting any time. The first and foremost question is how to identify when a support or resistance will break. To get started, when you see a series of higher lows into a resistance, you want to avoid selling at the resistance. The reason is very simple. Let me give you an example. Let's say you have a huge hammer in your hands and it's really powerful. And right in front of you, there is a brick wall. Now you take the hammer and smash against the wall many times over and over again. Now let me ask you, will the brick wall hold or is it likely to break? Well, common sense tell you that the brick wall is likely to break. And this is exactly the same concept when a resistance level is tested multiple times within a short period of time. The chances are the resistance will break. Now, I'm not 100% sure that it is going to break because no one can be 100% sure in trading. But the odds of resistance breaking are high. And likewise, when you see a series of lower highs into the support, the chances are the support level is going to break. This is because the prices hit the support level multiple times in a short duration of time. We will expand this idea further in this video when we will talk about breakout trades. Moving on to the most important question, how to find the best support and resistance areas to trade. We can approach this question with two trade ideas, the breakouts or the reversals. We will understand when one should take a breakout trade and when to take a reversal trade. Now let's start with the idea of trading reversals. The most important question associated with this type of reversal trade is how do you know that a particular level is likely to hold? Only if the support or resistance level holds can you enter a reversal trade. Otherwise, you will end up in the wrong side of the trade and you will incur losses. In order to trade reversals, I want to share with you a few tips to bear in mind. The first and foremost thing is that you want to see a power move or a momentum move or a strong move into the market structure. Now what this means is that if you have drawn an area of support or resistance, you want to see a strong move into the level. By strong move, I mean big or large bodied candles, which in turn means that for an area of resistance, you want to see a strong bullish candle coming into the area of resistance. And in case of a support level, you want to see a strong bearish candle coming into the support. Now this is what I mean by a power move or a momentum move. I know this sounds counterintuitive as to why one should trade a reversal when there is a strong momentum move. So you can ask me, why do you want to sell when there is such a strong bullish momentum into the resistance? And also, why do you want to buy when there is such a strong bearish momentum into the support level? Right now, don't worry because as we move on, we will find clarity as to why I am talking about this. Now the second tip that I have to give you is that you want to see a strong price rejection at the area of value. That is the area of support or resistance. You want to see a strong price rejection. The price rejection can be in form of a pin bar. The pin bar may be a shooting star or a hammer, etc. The idea is to see a long wick where the price gets rejected from the particular level that we are considering. Let's say this in case of resistance. A big bullish candle comes into the resistance and suddenly it gets rejected. And the stronger the rejection, the better. And that is exactly what you want to see. Let's take our discussion a little deeper and understand it closely. Initially, I have told that you need to see a strong momentum move or power move into the area of support or resistance. Let me explain why. You want to see large bodied candles into an area of support or resistance. Now let's say when you look at a resistance and when you have a strong move coming to the resistance level. At this point, ask yourself what exactly a resistance is. So in the previous video, we told that resistance is a price level which stops the price from moving up, or simply it is a level where the supply is high. Now also think about the fact that where exactly will you face an opposing pressure, or simply where do you think will the buyers come in so that they could buy at good prices. So if you think about a good price that the buyers would come in, and if you look at the chart, the chances are that buyers would always love to buy at an area of support. So it is obvious from the market structure that the buyers would wait for the price to retest or reverse to the particular support level so that they can buy or they can go long. Further, the price rejection at the resistance indicates that the buyers are not willing to buy at higher prices. And this is exactly the best place to initiate a short trade. The other reason being, the only place where you have to be afraid of the buyers coming back into the market is the support level. The advantage of taking a short trade at the resistance is that you can leverage the difference between the support and resistance level so as to obtain a high reward to risk ratio. However, on the downside, if you don't get a strong move or a momentum move into the particular level, instead what you get is a choppy move with a lot of swings like this, then it is not a good idea to short on the resistance. We can ask the same question here also. Where will the opposing pressure come in? That is, where will the buyers come in so as to get a good buying price? Well, this time around, the bias could potentially be at these swing lows. What this means to a trader who is looking to short at the resistance is that as the price approaches to these swing low levels, you will be facing opposing pressure that could turn the tide against you and you would not get a good reward to risk trade. That is exactly why you don't want to go short when there is a type of stair-stepping price action or a swing price action into your levels. The reason being, all these swing low levels are opposing pressures where the buyers could potentially come in and push the price against your trade. Now, another reason why you want to see large candles or larger momentum candles into a particular level is a very simple idea. Often when there is a strong price move, for example, there is a strong bullish move into a resistance level, most traders just look to buy the breakouts. I'm pretty sure that you have done it yourselves, right? So when there is a strong momentum, you might be thinking, let's buy the breakout. The market is rallying and it will continue to rally. So the simple decision at that point of time is to buy. Now this is where the twist in the plot comes. Where will you put your stop loss? Now because you are taking a breakout trade, it is pretty obvious that you will put your stop loss under the resistance or maybe in the middle of the range or somewhere in that close vicinity. What is the importance of this? Now what this means is that if the breakout fails, it is going to hit all these clusters of stop loss orders that is placed under the resistance. And what exactly are these clusters of stop loss orders that are waiting under the resistance level? They are simply orders to exit the market or square off the positions which were kept by those breakout traders who went long on the stock. This in turn means that these are actually sell stop loss orders which will induce further selling pressure in the market. Now, more stronger the bullish move is into the market structure, more breakout traders will enter the trade and there is more buying, and more buying in turn means more selling stop loss order behind the resistance. And if there happens to be a price reversal or if the price reverses towards the downside, it will hit all the sell stop loss orders of these breakout traders. Another key thing to remember is that the longer the price is away from the particular level, the better the trade is. And why is it so? The thing is, the longer the price is away from a particular level, the more it would attract the attention from higher time frame traders. For example, if a price has not retested to rupees 150 level on a daily time frame for let's say 3 months or 6 months or even 1 year, then you can be sure that this particular level can be seen on the weekly time frame or even the monthly time frame. And because of this reason, it will attract more traders from the higher time frame to pay attention to these particular levels. And that is why you get a strong price rejection or a reversal at a level which has not been tested for a long period of time. Alright, now let's learn to identify breakout trades. Most newbie traders trade more breakouts than reversals. When they see a strong move, they think that the market is going out to the space and they jump into buying the breakouts. In the next moment, there is a price rejection and there is a strong reversal in the opposite direction. And all these traders get caught on the wrong side of the trade, which in turn results in hitting their stop losses, which forces the price to go even lower. Now, when do you trade breakouts at supports and resistance? This concept is actually pretty much the opposite of what we have just learned earlier in case of reversals. So you know that price is likely to reverse at a support or a resistance when you have a strong power move or a strong momentum move into a market structure with a price rejection. When you are looking at it from a breakout standpoint, you don't want to see a strong momentum move into the market. In this case, what you want to look for is a price action that we have discussed right at the beginning of this video. We have to look for higher lows into a resistance which somewhat look like an ascending triangle, or we should look for lower highs into the support, which somewhat looks like a descending triangle, or even a third type where there is a price buildup which is supported by a moving average. Now let me cover each one of them. Starting off, higher lows into a resistance looks something like this. And you can see the price looks somewhat like an ascending triangle pattern. This is significant because it's telling me that the buyers are willing to buy at higher prices and the sellers are not interested or they are weaker. The ascending triangle pattern tells me that the sellers, in terms of their strength, are getting weaker or they are getting feeble. The thing is that the first time the sellers managed to push down the price by a good margin, and in the consecutive times it got weaker and weaker. And this is a sign of bullish strength that the market could possibly break out higher. At this instance, you don't want to be shorting at the resistance because number one, you don't have a momentum move into the resistance structure. And number two, if you were to go short into the resistance, there are swing levels which have been formed where the buyers could potentially come in, and result is that you will hit your stop loss. Now similarly, let's look at lower highs into the supports, which are the same thing. And it tells me that the sellers are in control and they are willing to sell even at lower prices. And top of it, from a price action standpoint, it is telling you that the buyers are also getting weaker, because this is a condition where the buyers barely push the price higher. And the subsequent times, it only moved smaller and smaller. They were not able to push it any higher. Similar to the previous case, you should not be going long in this case, as the sellers are the dominant force and there is a higher probability that the market will break down. And in case if you go long, there are swing levels which were formed during the ascending triangle formation where there is a possibility that the buyers can come in, which will in turn result in hitting your stop loss. Now you see the price action is quite interesting, right? Where one side is getting stronger and stronger while the other side is getting weaker and weaker. Now let's discuss the third type where a build-up is supported by a moving average. In this case, the price could just come to a key support or resistance level and it just consolidates there. Now if you bring up the moving average, like a 20 period or 50 period moving average, you will notice that the moving average supports the price and vice versa pretty nicely. It's like the market is really respecting the moving average and it is getting ready to break out. So if you find a build-up or a slight consolidation when the price reaches the support or resistance, it is always an indication that the price is about to break down or break out. Now let's hop on to the final question, how to find support resistance trading opportunity that most traders fail to notice. Now it's very simple. If you are a trader who enters at a daily time frame, then you have to go to a higher time frame like a weekly time frame, and then you have to look for build up or a tight consolidation. This is because when a higher time frame is forming a tight consolidation, there are chances that you will be able to find support resistance trading opportunities on a lower time frame like a daily time frame in this case. Now taking another example, if your trading time frame is a 1 hour time frame, you should spot a tight consolidation on a higher time frame, which in this case could be a daily time frame. And if you are able to find a tight consolidation in your daily time frame, then it is likely that you will find a support and resistance trading opportunity in the lower time frame, which is a 1 hour time frame. This is a pretty good technique that you can use to find support and resistance trading opportunities in the market. You can also use it for even shorter time frames like 15 minutes or even 10 minutes time frames. The only thing to keep in mind is to appropriately select a higher time frame and find a tight consolidation in the higher time frame so that you can find the support and resistance trading opportunity in the lower time frame. Now that is it for this video. I hope you have a good clarity about supports and resistance and how to approach your trades with supports and resistance after watching this video and the previous video. This price action course will not be complete if I don't talk about the market volumes. Throughout this course, our focus was strictly on prices. For the success of price action in market, volume plays a very pivotal role, be it the identification of trends or patterns, be it finding out the breakouts and false breakouts, be it the entry or exit from the trade. volume is a necessity. As you may know, volume is a leading indicator, which means that it precedes the prices. Or simply, before something happens in the price, the volume will show the changes beforehand. So our duty as a trader is to find the relationship between the price and volume so as to get an edge over the market or even to predict the market moves beforehand. So let's hop in right away without wasting any time. Basically, volumes indicate how many shares are bought and sold over a given period of time. So the more active the share, the higher would be its volume. For example, you decide to buy 100 shares of Tata Motors at rupees 485. At the same time, I decided to sell 100 shares of Tata Motors at 485. Or it can be different people who want to sell a smaller quantity at the same price, that is 485, which are accumulated together to give you 100 shares. That is, let's say one of them has 50 shares, the other one has 30 shares, and the third person has 20 shares. To sell at the same price of rupees 485, which will be matched with the buyer. So basically there is a price and quantity match which results in a trade. This means that you and I have together created a volume of 100 shares, or you and the other 3 sellers which we have talked about created a volume of 100 shares, because if you notice, overall 100 shares were transferred from the seller to the buyer. Now many people tend to assume the volume and count it as 200 because 100 were bought and 100 were sold. But this is not the right way to look at volumes, because only 100 shares transferred hands from one person to the other. With that being said, the volume information on its own is quite useless. For example, we know from the NSE website that volumes on Reliance India for this particular day is 16,700,000 shares. So tell me, how useful is this information when read in isolation? So if you think about it, it has no merit when used individually, and hence it would actually mean nothing for our analysis. However, when you associate today's volume information with the preceding trend in the price and the preceding trend in the volumes, then the volume information becomes more meaningful. Now, I will show you a table that consists of 4 price to volume relations for different conditions and the related outcome that is expected under such conditions. Now, before going ahead, don't fall into the conclusion that if you understand the relations provided here, you can trade right away. It doesn't work like that. In order to use this idea in market conditions, you should have a fair idea about the market structure and the participants in the market, of which you need to understand how the big players or institutions work. And number 2, you need to have a good understanding of the candlesticks and their relevance at different price areas. If you know these 2 things spot on, then this will just be a walk in the park. For those who don't have an idea, I recommend you to watch these 2 videos beforehand that we have already discussed earlier in our course. Before we understand the price volume trend table in detail, think about this scenario. When we are talking about an increase in the volume, what does this actually mean to a trader? What is the reference point, or what is the metric to say if the volume is high or the volume is low? Should it be an increase over the previous day volume or the previous week's aggregate volume? What is the reference point? As a practice, traders usually compare today's volume over the average of either last 3 days or last 5 days or last 10 days or even last 20 days volume, depending on the type of trader they are and what exactly is their time frame for analysis. Generally, the rule of thumb is that higher the time frame and higher the number of volume bars or data taken to calculate the volume, the more reliable the analysis is. For the sake of this video, let me consider the volumes from a swing trader's perspective. That is a 1-day time frame and 10 days of volume data for the average volume measurement. After the average volume measurement is done, we can use it for the comparison of today's volume. Now, today's volume is said to be the average volume if it is equal to the last 10 days average volume. Now, if today's volume is said to be higher volume or is said to be an increasing volume, then it is greater than the last 10 days average volume. And finally, if today's volume is said to be a low volume or a decreasing volume, then it is less than the last 10 days average volume. In order to get the last 10 days average, all you need to draw is a moving average line on the volume bars and the job is done. This feature is available on most charting platforms for free. So you don't have to calculate it by yourself every time. As you can see in this chart, the volume bars are represented as red and green bars and is placed at the bottom of the price chart. The blue line that is overlaid on the volume bars indicate the 10-day average volume. As you notice, all the volume bars that are over and above the 10-day average volume can be considered as increased volume. Now the question is, what does increased volume necessarily mean and why is it important? Well, increasing volume means higher trading activity than usual, which means more shares are being exchanged hands. Now, who do you think will be responsible for this? Can retail traders by themselves contribute to such high volumes single-handedly? Common sense tells you that it is not possible, and it's obvious that there is some institutional activity or large participation by some big players has taken place. On the same note, what does a lower than average volume mean to a trader? It means that big institutions or big players are not interested in the particular stock at that period of time, and the major volume is contributed by the retail participants and speculators. So the simple logic in stock market is to follow the big institutions if you want to be successful. We have discussed this in the market structure episode. Okay then, let's look at the thought process behind the volume trend table. When institutional investors buy or sell, they do not transact in small chunks or small quantities. For example, think about LIC or Life Insurance Corporation of India, which is one of the biggest DII or domestic institutional investor. Now, if they were to buy the shares of TCS, would you think they would buy 500 shares or 1000 shares? Obviously not. They would probably buy 5 lakh or even 50 lakh or even more shares. So what happens if they were to buy 5 lakh shares from the open market all in one go? Yes, it would definitely start reflecting in the volumes. And besides this, because they are buying large chunk of shares, the share price also tends to go up. Now, this is where I have to remind you that institutional money is referred to as smart money. It is perceived that smart money always make wiser moves in the market than most retail traders. So being smart or wise, they would not just buy all at once. Rather, they would accumulate the shares in small quantities over a period of days or weeks or even months so as to get the desired price that they want to buy. Now, most traders have a misconception that when the volume is high, the price will also move up or down with larger candles depending on the color and size of the volume bars. But this is a wrong way to understand the price volume relation. The thing is that volume is the number of shares that has traded hands, which can also mean that the orders can also be at a single price point. For example, let's say there are 10,000 buy orders and 10,000 sell orders, all at rupees 400 of a stock. And let us say that the average volume of the stock is 8,000 for the last 10 days. Even though the 10,000 shares were exchanged, resulting in a higher than average volume for the particular day, the price will not move up. The single reason being, all the orders are placed at the same price, that is rupees 400. On the other hand, the price were to move up with the increase in volume, then there should have been more buy orders at higher prices. That is, buyers should be willing to buy at even higher prices. And a similar case, if the price were to go down, then the sellers should be willing to sell at even lower prices. And it is at these instances we can leverage an increase in the volume for our trade decisions and not otherwise. The case is the same when the volume is low. The low volume does not necessarily mean the price would not do anything. It is just that the number of shares exchanged hands are a lower number. But there is still a possibility of buying or selling interest where the orders can be placed at higher or lower prices by the buyers or sellers respectively. Then there is a definite chance that the prices can do something. But on the downside, the big players are not interested in this particular stock, and it leads us to the conclusion that the price move was supported by retail traders, which is actually evident from the lower volumes. And hence, following the smart money is the wisest idea that you can have as a trader. Well then, we shall discuss each of the 4 cases in detail. If both price and volume are increasing, this only means one thing, that a big player is showing interest in the stock. Now, going by that assumption, the smart money always makes smart choices, and the expectation of the market turns bullish. The institution build their position slowly and gradually, but sometimes there won't be enough liquidity at a price where they want to buy, or simply there are not many sellers who want to sell at the price that the institution wants to buy. What this does is that it will in turn push the price higher. Keep in mind the fact that the quantity that these big players take for delivery is huge, and therefore every rupee is worth lakhs for them. And due to this reason, the institution starts to sell some quantity, which will in turn bring the prices down to where they want to buy. Because of this, the panic sellers would sell off the stock at the former price that the institution wants. And this phase of position buildup will look similar to an accumulation or consolidation in the chart. Once the institution finishes placing all the orders, that is when the market actually starts to move higher, and this is the time when the retail traders actually start to notice that the market is starting to go higher, and even they will start to join the party by buying the stock, which will push the price even higher. So this is the reason why one should look for buying opportunities in the stock, because the expectation turns bullish when both the price and volume increases. Now, whenever you decide to buy, ensure that the volumes are substantial. This means that you should be buying along with the smart money. Also you have to look for bullish candlestick patterns like hammers or engulfing candles to confirm your trade entry. You will find more details regarding this on my candlestick video. Now, all is well if you are an intraday trader. But if you are a swing trader or an investor, you will have to keep an eye on a third parameter, which is either the delivery volume or the delivery percentage. Now, delivery volume is the volume of the stock delivered to actual buyer out of the total traded volume. Or in simple terms, the shares which were taken as delivery for the particular day. And here ago, we need to go through both these parameters, because the delivery volume would also include the BTST trade, that is buy today, sell tomorrow trades, which will not give the correct picture. So we also have to keep an eye on the delivery percentage. But now, since the BTST trades are stopped, we can consider any one of them. You will get the delivery volume details on the NSE website. I will put a link to it in the description box. Now, the importance of delivery volume is that it gives you the real picture of the interest of big players or big institutions. If the big institutions start buying, they will take the shares for delivery. If you can see a rise in the delivery volume or delivery percentage for a few days, you will understand that there is a real buying intent in the market. Also understand that even if the overall traded volume is very high, it does not necessarily guarantee that the delivery volume will also be high, or simply it does not straight away mean that there is an interest from the investors. It can be seen as a heavily traded day and nothing else. Moving on to the second case, what do you think will happen when the price increases but the volume decreases? Think about the situation in the following terms. Number one, why is the price increasing? Simple answer, because the market participants are buying. Easy, right? Are there any institutional buyers associated with this rise in price? The simple answer is it is not necessary that there should be institutional buyers associated with the price rise. Now the critical question, how would you know that there is no meaningful purchase by the institutional investors or the big players? Now using the basic rule, if they were buying, then the volumes would have increased and not decreased. In this case, the price increased but the volume has decreased. Now what does the price increase associated with a decreasing volume indicate? It means that the price is increasing because of small retail participation and not really the influential buying by the big players. Hence, what this price-volume relation is telling you is to stay cautious in the market, because it would be a potential bull trap. That is, if you have taken a long trade, there are every chances that the market can reverse and go in the opposite direction, resulting in your loss. So, when it comes to decreasing volume but with increasing prices, we should be cautious and not to take any long-term trades, because the market is run by the retailers and there is no investor participation or investor interest in the stock. Going forward, the third type is a decrease in price along with an increase in the volume. This particular relation between price and volume sets a bearish expectation in the market. We will discuss why. First question to ask yourself, what does a price decrease indicate? A price decrease indicates that the market participants are selling the stock. But on the positive note, an increase in the volume indicates the presence of smart money or the big institutions. Now, clubbing both events together, that is decrease in the price and increase in the volume, it simply implies that the smart money is selling the stocks. They do this gradually so that the market participants won't panic. Think about it. What would have happened if they place large sell orders all at once? It would definitely be shown in both volume and price. That is, the prices would drop and the volumes would increase. This will further induce panic in the retailers who will further start selling. And because of this extensive selling, the prices would even drop further. And the institutions will not be able to sell at the desired price that they want. And this would directly affect their profits really badly. Being smart, they would sell the shares in small quantities slowly and gradually and generate the ample liquidity to sell at the desired price that they want. Now, going by the assumption that smart money always makes smart choices, the expectation in the market is bearish and we should look for selling opportunities in the stock. Now, whenever you decide to sell, ensure that the volumes are good. This also means that you should be selling with the smart money. And also use bearish candlestick patterns for your trade entry and confirmation. If you are a swing trader or an investor, it is a good practice to look at the delivery volume or delivery percentage, which in this case would be decreasing since the investors are selling their shares. Now, an increase in the volume does not necessarily mean an increase in delivery volumes. Moving forward to the final case where both the volume and price decreases. Ask the questions. Number 1, why is the price decreasing? Simply because the market participants are selling. Question number 2, are there institutional sellers associated with this price decrease? Simple answer, we can't be sure about it. Now the most critical question, how do we know that there was no meaningful sell orders by the institutional investors? Straightforward answer, if they were selling, then the volume would have increased. But in this case, the volume decreased. And what does a price decrease and a decreasing volume indicate? It means that the retail participation is the reason for the decrease in prices and not really the influential selling. So this is the case where you have to be cautious if you are planning to sell the stock, as it could lead to a possible bear trap. That means if you have shorted a stock, there is every possibility that the stock can reverse and go against your trade. Now that is it for this video, guys. Now that we have finished with the fundamentals of price action, from the market structure to the volumes, we are all set to learn the different price action strategies that we can employ in the market under various market conditions. The first one in the list is obviously breakouts. You may ask, why breakouts? It is just that breakout trading can be exciting. The price quickly moves in your favor and makes it seems like you're riding a wave and at the same time making a hell lot of money for you. However, that being said, breakout trading is also quite painful. For example, you notice the price breaking above the resistance. Now the candles formed are big and bullish and you instantly get the fear of missing out. So you decide to go long. And as soon as you enter the trade, hoping to get a strong move up, the price does a 180-degree reversal. And before you know it, you bought the highs and now your stop loss is hit. And if you have not placed a stop loss order, you will see your account bleeding. I hope this has happened to at least some of you. This brings us to a very critical question. How do I filter for high probability breakout trades and know which are the ones to avoid? We have talked about the basic idea governing a breakout and a reversal in the 6th episode of this price action course. I want you guys to watch that video first because this video will be a continuation of where we left off in episode 6. And so, in order to understand the concept completely, watch that episode and then attend this video. Well then, a breakout occurs when the price moves beyond a certain level, not just any level, but a level of importance or an area of value. The area of value can be anything from a resistance, a support, to a trend line or a moving average. The very idea of breakout trading is entering the trades when the price momentum is in your favor. However, no system in the stock market is perfect. Keeping this in mind, Let us first discuss the positives and shortcomings of a breakout trade. I will explain its pros and cons. First of all, let us talk about the pros of a breakout trades. Breakout trades comes with a limited risk, which means that in many instances, breakout trades present themselves during the consolidating market phases. So the initial stop losses that we place for our trades may be relatively small according to the compression or the price range used for the market entry. So in addition, a confirmation of a trade's failure may come very rapidly, which offers an opportunity for a quick exit, which simply means that if the trade does not go in our favor, the price will reverse immediately and hit our stop loss. We don't have to wait a whole day for the trade to complete. And also, the risk to reward associated with breakout trades is much better so that you can control your stop loss accordingly. The second advantage is that the momentum is in your favor. If a breakout trade is successful, large gains are possible. So getting in on strong trend early can be a profitable situation. And the third advantage is trade management, which means that the market entry and exit are predefined, with the stop losses and profit targets being identified before the trade. So that our only job is to place the stop losses and targets and wait for either one of them to get hit. Now talking about the disadvantages, number one is false breakouts. So false breakouts are a considerable part of the breakout approach of trading. No matter how sound your methodology used in identifying the breakout is, or how good your system is in quantifying the market, in many instances, a signal may appear to be solid, but it will end up lacking the intended participation or the increased participation from the market participants, which is the most essential thing for a breakout trade to succeed. The second disadvantage is associated with opportunity cost. The optimal breakout setups don't occur frequently, so searching for setups can often leave a trader on the sidelines instead of pursuing other opportunities in the market, or simply the number of breakout trades are less or it is hard to come by. Before venturing into different breakout trading techniques, it is always better to understand how not to trade breakouts in the first place. Let us talk about instances when you should avoid trading breakouts. First of all, under no instance you want to be trading breakout against a trend. Now, trading against the trend is quite illogical for me as a trader, and you don't want to do this in the first place. We have all heard the famous saying, a trend is your friend until it bends. So let's see why trading with the trend puts you in a much more favorable position than going against it. When you are moving with the trend or in the direction of the trend, the moves that you get are pretty strong and it can last for longer periods compared to someone who wants to trade against the trend. For example, let's look at the bull traders who are going long in a bearish market. Look at these up moves or corrections that are resulted from trading against the trend. So these are up moves which are very sharp and very limited. You can see that the strength of the bulls is very weak compared to the bears from the size of the candles formed. So if you are looking to trade against the trend, then you can see that there is not really much of a strength in the move, or the move is pretty weak, which in turn means that the gains from these trades are pretty much limited because you are trading against the trend. Likewise, if you want to trade breakouts, I would strongly discourage, or in fact I will strongly advise you not to trade against the trend. And let's say you are looking to trade the breakout higher. I would say the chances are this breakout isn't going to go very far because after all you are trading against the trend. What is likely to happen in this situation is that even if you get a breakout, it would not trade any higher before it will collapse lower, which will give you a false breakout at that point. So you have to be beware of trading against the trend, whether you are trading breakouts, pullback, or whatever entry technique you are using. Trading against the trend is not usually the ideal situation for you as a trader. Moving on, you don't want to be trading a breakout when the price is far from the market structure. We have talked about the market structure in the second episode of this price action course. The important thing that I have to tell you is, whatever market you are looking, be it bullish or bearish, or whatever time frame, be it swing time frame or intraday time frame, the principles we are discussing are essentially the same and it applies to all of them equally. Whether it is a 4-hour time frame, a daily time frame, a weekly time frame, or hourly time frame, they're all the same. Nevertheless, what we are looking at right now is an uptrend. At this point in time, you see that the price has traded at a point which is so high. And some of those FOMO traders will look at this chart and decide to get long before the price trades any higher without them. So they enter long at a high price over there. Now what the problem with going long at this high price based on the example? Think about this. Where are you going to put your stop loss? Or in other words, where is the logical place for you to put a stop loss? The possible answer is the previous resistance level with a possibility of it becoming a support if the price drops down. The level is the one that you need to lean against to place your stop loss. And of course, you don't want to be placing the stop loss exactly at the level as well, because the price could just come into the level and bounce higher after hitting your stop loss instantly. So the chances are you need to put your stop loss somewhere below the resistance, because in this case, the price has to move at least an equal distance as that of your stop loss so as to achieve at least a 1:1 risk to reward. As you can see, having a large stop loss gives you a poor risk to reward. So I would discourage you to trade breakouts when it is far away from the market structure, because of the fact that you need to have a very large stop loss and it gives you a very poor risk to reward as a result of it. Now that we have understood what not to do, we are ready to learn the different techniques of breakout trading. There are two things to bear in mind when you have to identify a high probability breakout trade. They are, you want to trade with the trend or trade in the direction of the trend. And secondly, you want to trade near a market structure or an area of value. Now let me explain each of them in detail. Let's start with the trend trading breakout strategy. So trading with the trend is something which you should be familiar by now, because earlier I discouraged you from trading against the trend, and it only makes sense to be trading with the trend. Now here's the deal. For an intraday trader or a swing trader, let us say, in a strong trend, the price tends to stay above the 20-period moving average. So if you are waiting for a pullback to the moving average or even a trend line, then most often or not you will be disappointed, as the market will continue making new highs without you able to initiate a long trade. The thing is that there is a time for trading pullbacks, but it's definitely not when the market is in a strong trend. We will discuss the pullback trading systems in the upcoming episodes. Right now, in this scenario, you want to trade breakouts instead of pullbacks. This type of breakout trading strategy is called as the trend trading breakout strategy. Here you can either trade the break of the swing high or swing low depending on the type of the trend the market is in. Let's see how this works with an example. Let's say the market is in a strong uptrend and the market respects the 20-period moving average. The idea of this trade is to buy the breakouts above the swing high. You can see that the price has consolidated and broke higher. The price looks like forming a flag pattern. Then you could possibly trade higher from it. In this case, the trend is in your favor. So the ideal thing is to trade the breakout in the direction of the trend. Here you will increase the odds of the trades working out in your favor. The exact entry for this trade would be the candle above the breakout candle high. The next thing that you have to do, exit when you're wrong. This refers to your stop loss. In other words, you want to ask yourself, at which point on the chart will I get out of the trade if the market moves against me? As a guideline, your stop loss should be at a level where, if reached, will invalidate your trading setup, which simply means that keep your stop loss at a level which you think will invalidate the breakout trade that you have taken. So in this case, set your stop loss 1 ATR below the swing low. If you don't know about what ATR indicator is, watch this video on ATR indicator. Or else you can simply place the stop loss below the trend line or even below the 20 moving average for that sake. Now the second exit is when you're right. On the flip side, what if the market moves in your favor? How would you exit your trade? It is simply about setting the targets. My suggestion is to ride the trend for all it's worth, which means there is a good chance of the price heading even higher. For an intraday trader, place your target as the next potential high point or the swing high, which is actually difficult to identify, or it can even be the nearest resistance level. But for a swing trader, I would ask you to ride the trend and exit the trade only if the price closes below the 20 moving average or when the market breaks out of the structure. By the structure, I mean uptrend in this particular case. That is, when the market stops forming the higher highs or higher lows is the time to exit the trade. So you can place a similar entry and exits for a downtrend with proper modifications. Moving on to the second strategy, which is trading near the market structure or an area of value. Earlier, we have discussed that when the price is very far away from the structure, it doesn't really make much of a sense because your stop loss is so large and you will get a very poor risk to reward. But what if you're trading the breakout when it is near the structure? In this example, you can see an area of resistance. Resistance in a market, as you may know, is an area where there will be potential sellers coming in or where the supply is higher than the demand. Now the price tested the area of resistance and the price break and closed above it. This is a breakout of resistance, which is slightly different from the breakout of a swing high as we have discussed earlier. Because resistance is a much more respectable area in the chart, so the probability of the trade success in this case is higher. Now if you are looking to get long right now, where is the logical place to put your stop loss? The possible answer would be below the previous resistance turned support. You can put the stop loss somewhere below the previous resistance. So this is a much tighter stop loss. With a much tighter stop loss, it gives you a better risk to reward because the price does not have to move a lot in your favor to start giving you the gains. And why do you think you have a much tighter stop loss? It is because you are trading much closer to the market structure. So compared to the earlier example where the structure was too far away, it does not really make any sense to make a trading in that scenario. Now, identifying when to trade is as important as knowing how to trade. The breakout trade near a market structure can be classified into three types. Number one is breakouts with build-up. Number two is higher lows into the resistance level. And finally, number three is the lower highs into the support level. Let's start with the first one, that is breakouts with build-up. Now, build-up is basically a congestion or consolidation or a tight range near an area of value. You can think of a build-up along these lines. A lot of traders will look at the prices consolidating at the resistance. These traders go short at the resistance or somewhere in the middle of the range and they will place their stop loss above the resistance. That's what they will do because at the resistance it makes sense to go short. But think about this a little deeper. If the price is consolidating at the resistance, what does it really tell you? You know that resistance is an area where there are potential sellers who will come in and push the prices lower. But in this example, the price is consolidating at the area of resistance. So where are the sellers? Why aren't they pushing the prices lower? And why is that? The reason why the sellers are not pushing down could be one of these two things. Either there are no sellers out there who are interested in selling, or there are equally strong buyers at the resistance. No matter what the scenario, whether it is number one, there are no sellers, or number two, there are equally strong buyers, it does not look good for traders who are looking to short either way. And on top of that, the clusters of stop losses above the resistance level would create an incentive for the smart money or the big players to actually break out higher so that they can leverage the stop losses to take the market above the resistance. So my point is that when you see a consolidation at a resistance, basically a build-up just in front of the area of resistance, this is a sign of bullish strength. In this scenario, I'll be looking to go long and my trade entry is when the price trades above the breakout candle high and I will put my stop losses below the resistance level. That is below the low of the build-up or consolidation. Or you can even keep it around 2 times the ATR value below the resistance. Now talking about the targets, my target would be the next nearest structure. In this case, the next nearest resistance level. Now look through your charts, look through in the price approaching the support area and ask yourselves what happens if there is a consolidation at the support area and what will you do? Comment down below. So build-up is a core concept whenever we trade breakouts. However, there are variations of it. For example, when you see higher lows into resistance, it is a sign of a strength or weakness. Now think about it. When you see higher lows into resistance, what does it tell you? It tells you that there is not enough selling pressure or the sellers are weak. It also tells you that there is strong buying pressure which supports the higher prices. And the final thing to keep in consideration is that there are buy stop loss orders which are clustered above the resistance, which are kept by those sellers who went short at the resistance level. And clearly, this is a sign of bullish strength. Now, you might be familiar with this chart pattern called the ascending triangle pattern. So, if you spot such a pattern in the market condition, it means that the market could break out higher, right? It's the exact same scenario here. You should be looking to go long in this case. The entry should be above the breakout high, and your stop loss should be slightly below the last higher low to the resistance level. And finally, your target for the trade should be the next nearest resistance, or it should be equal to the length between the first higher low level and the resistance level projected above the resistance level. Now let us look at a situation of a breakdown. This is the inverse of what you have learned earlier. So whenever you see lower highs into the support, it tells you three things. Number one, there is no buying pressure or the buyers are weak. Number two, there is strong selling pressure pushing the price even lower. And number three, there are sell stop loss orders clustered below the support level which are kept by the buyers who went long at the support. Now clearly, this is a sign of weakness in terms of buying. And you might be familiar with this chart pattern called the descending triangle. So if you spot such a pattern in the market, it means that the market could break down lower. In this case, we should initiate a short trade below the breakdown candle low after the candle closes below the support level just for confirmation. The stop loss can be kept above the last lower high into the support, or it can be 2 times the average true range value above the support level. And finally, talking about the targets, in this case, target should be the next support level, or it should be equal to the length between the first lower high level and the support level projected below the support level. Moving on, let us look at a highly profitable breakout trade scenario. Now here's the thing, the market is always changing. It moves from a range to a trend, from a trend to a range, etc. The longer the market stays in a range, the harder it breaks. This is true, but why is it true? Because the longer the market is in a range, the more orders are placed in the market. Let me explain. The bullish traders will put buy orders above the resistance, hoping to cash the breakouts. Similarly, the bearish traders will look to short the market at the resistance, and they will have their stop loss, which is also a buy stop loss order, and they place it above the resistance. And as the time passes, you will get an overwhelming amount of buy stop loss orders above the resistance level. And by some chance, if the market manages to break out of the resistance, it will trigger all of these clusters of buy stop loss orders, which will fuel further buying pressure, and in turn, it will take the market higher. So, if you want to identify explosive breakout trades with high profitability, you have to pay close attention when the market is in a range for a long period of time. Because the longer it is in a range, the harder it breaks and the more profitable you become. In the previous episode, we have discussed about breakout trading in great detail. Breakout trading is one of the oldest trading styles in the book. You watch the price consolidate within a range, and then when the price breaks out of that range, you pounce onto the trade and enjoy the benefits of a strong move. And often when the price has been stuck in a range, it will move out of that consolidation range with some good momentum, giving the traders a good profit potential. But, and it's a big but, the breakout pattern has an evil twin, which is actually a curse to all the breakout traders, and it's none other than the fake out. If you have ever traded breakouts, you'll recognize this situation. Just when you think you have caught the big move, the market turns against you and shakes out of your trade. So, how can we tell the difference between a breakout and a fake out? Now, there are a number of tools that traders can use. But the first thing I have to let you know is that there is no way you can avoid false breakouts completely. There are certain times, no matter how good a setup you have, you're still going to get caught in a false breakout. But you can minimize the chances of getting caught in a false breakout We have got some price action methods and some tips that you can make use to minimize your chances of getting a false breakout. With that being said, the first tip I have for you is to stop chasing the power moves or stop going after the power moves into an area of value. What are power moves? I have talked about power moves in the episode 6 of this price action course when we talked about reversals. But let me talk about it briefly so as to brush up your memory. If you see a big or strong momentum move with large candles, this is what a power move is. Now if the price moves up from a level with little or no pullback and then it goes up higher, breaking an area or a level of value like a support or resistance, then my advice is not to chase the breakout of this type, because more often or not, the market tends to reverse under these conditions. And why am I so sure and why is it so? Let me give you a very simple explanation of why this actually occurs. When you chase a market where the price is making a strong move or a power move, there is no floor or support to these higher prices. Now if you look at the chart, most of the time the price exhibits a specific type of price action where the prices goes up and then retraces or pulls back. In this type of price action, there are levels like swing lows to support these higher prices. What this means is that, for example, take the case of a resistance. If the market were to reverse from the resistance, it would find a floor or a support where potential buying pressure could push the price higher. These types of moves are more sustainable because they are a series of higher swing levels along the way to support these higher prices. Now what happens when the market has given a power move into a level? In this case, let's talk about a resistance level. It means that there are no intermediate swing levels to support these higher prices, or there is no obvious levels for the buyers to come in to oppose the sellers if they sell at the resistance. Now the only possible area for buying is the previous support level, and so there will be a lot of sellers waiting at the resistance to sell, and also there will be a lot of buyers who looks to buy the breakout, who place their stop losses below the resistance. Now there is a cluster of sell orders below the resistance by both the sellers and the buyers. And by some chance, if the price manages to reverse, all of these stop losses would be triggered, which will induce further selling in the market, and the market will reverse even lower. And there is a good chance the reversal comes, it can be very swift towards the downside to the nearest support level or the floor area where the buyers could then potentially come in. But this is going to be a huge distance, and for any buyer who hasn't placed a stop loss can end up bleeding his account. So as a matter of fact, you want to stay away or stay on the sidelines if you are a breakout trader under such conditions where there is a power move in the market to an area of value. Now we will look at some price action tricks that you can easily apply on the market to stay cautious of the fakeouts. However, the problem with each of them is that you are left waiting for the candles to form their patterns, and sometimes this might be a reason for missing out on some of the trades. So it's up to your decision making as a trader in the real market conditions for them to make any sense. Now there are clues in the candlesticks and volume data which can give information whether the breakout is a genuine breakout. And these are worth considering and can be used in conjunction with other tools like indicators. A breakout occurs because the price has been contained below a resistance level or a support level for potentially some period of time. Now the resistance or support level becomes a level which many traders use to set their entry points or stop loss levels. So when the price breaks through the support or resistance level, the traders waiting for the breakout would jump in, and those who did not want the price to break out will exit their positions to avoid larger losses. This is very much clear. Now this flurry of activity will cause the volumes in the market to rise, which shows a lot of traders were interested in the breakout level. Now the higher than average volume helps to confirm that it was a breakout. But if there is a very little volume on the breakout, then the level may not have been very significant to a lot of traders, or not enough traders felt convinced to place a trade near the particular level. And most of these low volume breakouts are likely to fail. In case if we are talking about an upside breakout, if it fails, the price will fall back below the resistance level. And in case of a downside breakout of a support, often called as a breakdown, if it fails, the price will rally back above the support level. In some instances, even after a high volume breakout, the price will often retrace or pull back to the breakout point before moving in the breakout direction again. This is because the short-term traders will often buy the initial breakout, but they will attempt to sell quite quickly for profit. This selling by the short-term traders will temporarily drive the prices back to the breakout point. Now, if the breakout is legitimate, then the price should move back in the breakout direction after the retest or pullback. And if it does not, it is a failed breakout and the prices would reverse. Analyzing volumes were one way of identifying if it is a breakout or a fake out. But as I have mentioned earlier, it does not work every time, and there are occasions when this idea will fail. So let us consider a few more ideas to keep in mind so as to distinguish between a fake out or a breakout. The first thing is that we have to wait to see if the candlestick closes through the line of support or resistance, which means that the real body of the breakout candle should close above the resistance level, or the real body of the breakout candle should close below the support level, which in turn means that just a wick poking through the level is not enough to confirm a breakout. So it's a good rule to follow, but on its own, it's not particularly reliable. Now the second thing is that you have to wait for a close beyond the support or resistance level, and then you have to wait for the price to retrace back to the level or pull back by a little bit and then move in the direction of the breakout, and this candle should close beyond the closing price of the breakout candle. This is a resistance turned support or a support turned resistance method, which is a reliable way to trade breakouts. But on the downside, there is a lot of patience required because there is a lot more waiting around, and sometimes the prices won't even retest or pull back to the level, and chances are you might miss the trade. Now the third point is to look for big candlesticks, which will indicate that there is momentum behind the breakout, and you have to check for large breakout volumes, which is higher than the previous volume. But on the downside, a very large candle means that you have potentially missed a hefty part of the move. So it can right away affect your risk to reward as well as the placement of your stop losses. And the final point to keep in consideration is that you have to look for a price build-up at the market structure, which may be a tight consolidation near the area of value or higher lows into the resistance, similar to an ascending triangle, or lower highs into the support, similar to an ascending triangle, which are credible enough patterns that can give you high probability breakout trades. We can learn a lot more about them in the previous video. Now we will look at a faster way to get a breakout confirmation using an indicator, which will give us an immediate yes or no confirmation as to whether we can rely on this breakout or not. So we have to add the RSI indicator or the relative strength index indicator in our chart. So when we are looking for a breakout, we are expecting the breakout to come with a degree of momentum, and we will use the RSI indicator to find that momentum. So basically RSI is a momentum indicator and it measures the speed of a move. So if the speed is increasing, the momentum will be building or increasing. In this particular scenario, I am talking about RSI convergences. RSI convergence occurs when the RSI direction mirrors the price trend. For example, if the price of a security trends upwards, then the RSI will also trend upwards. This is what I mean by RSI convergence. So if the price is moving up through an area of value, we want the RSI indicator to be showing higher highs, which signals building momentum or increasing momentum. The idea is that if the market momentum is increasing, the RSI should also be increasing. The same is true if the prices are headed down and breaking through the value of support, which will indicate a momentum towards the opposite direction or the downward direction in the RSI too. So this confirmation for both bullish and bearish signals are generally more useful when the RSI period is 14 days or more, and anything below the 14 period may be typically considered less reliable for confirming the convergence. And of course, no indicator is infallible, but using RSI to confirm breakouts will give you a significant edge in the market. It adds weight to the evidence of a possible breakout and not a fake out. So I recommend that you add it in your charts and see what it can do for you. Now coming to the most important part or the important point of this video, you have to backtest these techniques that I have discussed with you so as to understand how reliable each system is, and then choose a system of your liking and convenience, because practice makes you perfect and backtesting can save your account. this episode, we are going to learn all about trading pullbacks. A pullback to an area of value is one of the best techniques when trading in the market direction. And it is also one of the safer techniques because of the confirmation that it gives. We will discuss the pros and cons of trading pullbacks, and we will talk about the likely places on the chart where the market will pull back and how to approach your trades. So if you are ready, let's begin. What actually is pullback trading and why does it work in the market? Now, a pullback is when the price temporarily moves against the underlying trend in the market. For example, in an uptrend, a pullback would be a move lower, or we can say it is a corrective move. On the other hand, in a downtrend, a pullback would be a move higher. So in essence, what you are trying for pullback trading is to buy the dips in the markets or the retracements to a critical level or the corrections in an existing trend. For example, the price breaks out of the resistance level with a strong candle and then it retraces or pulls back or tests the resistance level and then move up higher. Another example would be if the market is trending higher. You are always looking to buy the dip or to buy the retracement or to buy the pullback so as to buy at the least possible price. And in case of a trending market, the reason why pullback trading works is because when the market is trending, it does not go up in a single straight line. Instead, in an uptrend, you can expect to see a series of higher highs and higher lows. So, as a pullback trader, what you are trying to do is to time your entry on the pullback or the retracement or the correction. So, you are basically entering the trade as the market trades at lower prices during an uptrend. As a pullback trader, you are trying to take a trade in the direction of trend, but you look to enter when the market is sort of going against the trend on the retracement or the corrective move, but you are still trading in the direction of the trend. And the reason for pullbacks in the prices is simple. It is due to the short-term profit booking by some traders, which causes the prices to dip lower. Now let us move on to understanding the pros and cons of pullback trading. We will start off with the positives. With pullback trading, you are basically buying low and selling high. For example, if you are trading pullbacks in an uptrend, you are basically buying at lower prices and the intention is to sell higher. And if you are selling pullback in a downtrend, you are basically selling at higher prices so that you can buy back at lower prices. And the second thing about this is that it is actually easier when it comes to your trading psychology when you are trading the pullbacks. The reason being, you are basically trading from an area of value. Because buying low and selling high is something that we are all accustomed to even when we start learning about the markets. Think about it in terms of a small business. Basically, what we want to do is to buy at lower prices and then sell at higher prices. Now we will talk about the shortcomings of trading pullbacks. Now the downside of pullbacks is that you might miss the move more often or not. Let me explain. For example, we know that an uptrend consists of a higher highs and higher lows. Let's say the price is pulling back or retracing back right now. Assuming that you are hoping the prices to retest back to the lows onto the trend line or the moving average. But what happens in the market is that the price does not pull back deep enough. And then it broke out higher without you being able to take an entry. So it ended up causing you to miss the move. This is the biggest disadvantage when it comes to trading pullback, which is that sometimes you actually miss the move while waiting for the price to come to your desired level. The second disadvantage, or maybe I won't call it a disadvantage, is that pullbacks are not suitable for impatient traders. Now, if you are an impatient trader or you have no patience to wait for a pullback, then this strategy might not be your piece of cake. Now that we have understood about the advantages and disadvantages of a pullback trade, let us learn how to approach a pullback trade. So there are a few things to look for on trading a pullback. The first point is to identify the market trend. Now, the first and foremost thing that you have to figure out while you trade pullbacks is to find the existing market trend. You must have a trend in the market because most often you will encounter a pullback opportunity when there is a trend in the market. And more importantly, make sure to trade in the direction of the trend and not go against the direction of the trend. Now, I'm not saying that there won't be any pullback opportunities if the market is not trending or if the market is in a range, but instead, the probability of getting a pullback setup is higher when there is a trending price action. And most often or not, during a range or consolidated price action, the market tends to give explosive breakouts where the chances for pullbacks are lower due to increased interest and participation by the market participants. Now, the second point is to identify an area of value. Here's the thing. Just because the market is in an uptrend doesn't mean you want to blindly enter a trade. Instead, you want to be trading from an area of value. An area of value could be any of these, including a swing low or a swing high, a support or a resistance level, a trend line or a moving average, etc. These are all potential areas on your chart where buying or selling pressure could step in. Now, the third point to consider is to look for an entry trigger or an entry area. Assuming that the market is trending higher and it has made a pullback towards an area of value. But this does not mean that we can blindly hit the buy button. As a pullback trader, you want to look for specific entry triggers to let you know that the buyers are stepping in, or to make sure that buyers are in control and they are about to take the prices higher. The entry trigger could be as simple as reversal candlestick patterns, which may be bullish hammers or bullish engulfing patterns, etc. So that's an entry trigger for us to time our pullback to get on board the trade and to join the existing trend in the market. Now, the fourth point is setting up your stop loss. Since you are trading pullback, the most important question is, where do we set our stop loss? Logically speaking, if you are trading pullbacks on a uptrending market, then your stop loss should be below the lows of the pullback. So in case if the market is on an uptrend and you have kept your stop loss below the swing low, this means that if the market corrects or retraces and breaks below the lows of the pullbacks, it tells you that this pullback has failed and you want to get out of this trade. So in order to be safe and not hit your stop loss before the pullback finishes, you will have to identify the lows of the pullback and give some buffer below the lows. For this purpose, you can either use the ATR indicator or you can even set it based on your risk-taking ability. Let's take a look at the ATR method briefly. Let us say the low of the pullback is 100 rupees. And let us say you pull out the ATR indicator and the average true range of the market is rupees 5. You can simply take rupees 100, which is the low of the pullback, and subtracts rupees 5, which is the value of the ATR at that specific period. Now your stop loss turns out to be rupees 95, which will set a small buffer below the low of the pullback. Now a similar approach can be taken in case if the market is on a downtrend. And the final point is setting up your targets. Now where do you take profits? Let's say you are trading in the direction of an uptrend. What you can do is to reference the extreme swing high to take the profits. When you are trading pullbacks during an uptrend, you are buying the dip when the market has retraced against the trend. If you look prior to the retracement, you should be able to identify a swing high on the chart, and this swing high could be a reference point for you to take the profits. Now, if you are looking to buy a pullback and you went long and the market is moving favorably in your direction, you can look to take the profits just before the swing high or before the nearest resistance if you are an intraday trader. And you can ask me, why not after the swing high? Or why not at the swing high? Or why not at the resistance level? The simple reason being, swing highs and lows, supports and resistances are not specific levels on the chart. Instead, they are areas or zones on your chart. This means that the price could come close to the swing high but may not be able to reach the exact price point and then start to reverse from there. So if you don't want to watch your open profits come close to your target only to do a sudden reversal and then hit your stop loss, what you want to do is to set your profit target just before the recent swing high or the nearest resistance level for this example. Now that we have learned how to approach our pullback trades, let us move on to the different ways of trading pullbacks successfully and how to employ the entry and exits in the right manner. Starting off with breakout pullbacks. Breakout pullbacks are very common and probably most of you have encountered them. Breakout pullbacks commonly happen at the market turning points. That is when the price breaks out of a consolidation pattern or a range. Now, some of the most popular consolidation patterns includes the head and shoulders, the wedges, triangles, rectangles, etc. So the question that naturally comes up is how to trade the pullbacks. Although there are many ways how you can approach the pullback trading, I will talk about two main concepts of pullback trading during a breakout. Now, these principles can be applied to all other pullback scenarios that we will discuss along. Let us take the case of an aggressive trader. Now, the aggressive trader waits for the price to come back to the pullback area, which may be a support or a resistance level, a trend line, a moving average, etc. And he enters the trade right away when the price pullbacks to the level. Let us say the point 1 marks this approach in the scenario of a breakout and pullback. Now, there are a few more points that you need to consider when choosing such an approach. Using an aggressive trade entry, you may be able to enter at the best possible prices, as this point can often mark the extreme point of the correction wave and the pullback phase. So the potential reward to risk ratio is highest following such an approach because the stop loss can be placed very tightly. But the major drawback is that you enter a trade against the price direction without any confirmation. So the price could easily go against your trade. So such an approach can therefore have a lower win rate or a lower probability of success. But the higher reward to risk ratio may offset it though. But I wouldn't go by this method. Me, being a conservative trader, waits until the price continues the trend structure and breaks over the pullback. With this approach, the trader goes with momentum and confirms that the trade is in the desired direction, unlike the aggressive trader's case where there was no confirmation of the trade direction. Now, the conservative approach or the conservative entry happens later, and therefore the potential reward to risk ratio is smaller. If you ask me, there is no right or wrong when it comes to trading, and it all comes down to your personal preferences as a trader. Now, talking about the stop losses, you have to place the stop loss below the pullback low in case of a breakout on the upside, and make sure to add the suitable buffer based on your risk potential, or you can even use the ATR indicator to do the same. It is always better to stay cautious as to not move your stop loss to break even, because this is a very dangerous and unprofitable thing to do. And the reason for this is that pullbacks happen so often in the market. After a long uptrend, the market stays in a range between defined levels. Now, many traders use the levels to time their breakout entries. In this case, we are anticipating a breakout on the downside, and most traders would use the support level to time their breakout entry. But where they go wrong is that they move their stop loss to break even too soon, and when the breakout pullback happens, they will get kicked out of their trade just to see the price return in their anticipated direction, but without them. Finally, the targets can be the next potential resistance level, or place a suitable target based on the type of consolidation pattern the market was in right now. Be it a wedge, be it a triangle pattern, be it a rectangular pattern. Use a suitable target based on the consolidation pattern formed in the market. Now, the second way of trading pullbacks is using horizontal steps. Now, the stepping behavior can be observed during many trending phases in the market. During the ongoing trending phases, the price will often present those stepping patterns. This pullback approach is a great addition to the previously discussed breakout pullback. The breakout pullback happens very close to the market turning points. But if the trader misses the initial entry opportunity, the horizontal steps can allow the trader to find alternative entry scenarios. It also helps the trader to enter a trade even if the pullback does not form a swing low touching the trend line or a moving average. In case of an uptrending market, the entry in this case would be during the retracement from a swing high level to the previous swing high levels, and using confirmation candlesticks like bullish engulfing or hammer patterns for the trade entry. And if you talk about the stop loss for the trade, it would be suitable to place the stop loss below the step pattern or the swing low with a suitable buffer depending on your risk appetite. Further, a trader could simply choose to use the stepping pattern as a trial stop loss behind the trend in a much safer way. In this case, the trader waits until the price has completed a particular step and then trial the stop loss behind the last pullback area. And because of this, the stop loss is protected and it is not very vulnerable. A target in this case would be each of the swing high levels as the price moves in your favor. Now the third idea should have been trend line. We know that trend lines are famous pullback tool, but the drawback with trend lines is that it takes longer to get validated. As a thumb rule, we all know that a trend line requires at least 3 contact points to get validated. You can always connect 2 random points, but only when you get the third contact point, you are really looking at a trend line. Trend lines can work nicely in addition to other pullback methods, but as a standalone method, the trader will miss many opportunities as the trend line validation takes a long time. So instead of using a trend line, we can use the moving averages for pullback trading. And without any doubt, moving averages are amongst the most popular tools in technical analysis, and they are used in many ways, including trend identification. And you can also use them for pullback trading as well. You could use a 20 period, a 50 period, or even a 100 period moving averages. It does not really matter, and it comes down to whether you are a short-term trader or a long-term trader. Now, short-term traders generally use shorter moving averages to get the trade signals quicker. And of course, shorter moving averages are more vulnerable to a lot of noise and wrong signals. And longer-term moving averages, on the other hand, moves slower, and so they are less vulnerable to noise, but you may not get much trading opportunities as in case of the short-term moving averages. So it is up to you to weigh the pros and cons of your own trading style. For the purpose of this example, I will use a 50 period exponential moving average and the price is in an uptrend. Now here we can see that the prices are correcting and reaching the moving average, and it is actually respecting it. The entry in this case would be above a rejection candlestick from the moving average, like a bullish pin bar or a hammer and bullish engulfing candles, which shows that the buyers are willing to buy at higher valuations. You can place a stop loss below the moving average line, adding some buffer space, because it is very common for the price to overshoot the moving average and show very deep pullbacks. And that is why you need to give your stop loss more breathing room if you choose such a pullback strategy. And if you enter the trade with proper confirmation and not being aggressive to enter the moment the candle pulls back to the moving average, then you can actually save yourself from the overshoot problem. Finally, a riding trend till the end is the best possible target. In case of an intraday trader, look to place the nearest resistance as the target. And for a swing trader, exit the trade either when the price breaks out of the moving average line or exit the trade when the market structure changes from trending to range or consolidation. So as you have seen, there are many different ways on how to approach the pullbacks. You can even use it with Fibonacci levels also. You can even combine the various tools to come up with even stronger signals. With that being said, it is always a good idea to backtest what you have learned to get a sense of how the strategy works in real market condition and see if it works for you. Reversal trading can be one of the most profitable trading strategies you can use. You can trade reversals in trending markets, ranging markets, and even against the trend. We have discussed the concept regarding reversals in the 6th episode of this price action course. Do check out that video to know the basic stuff regarding how reversals work. In this video, however, we will talk about the reversal trading strategies with respect to price action. Reversals refers to large price changes where the trend changes its direction altogether. But the thing is that when it starts to occur, a reversal isn't distinguishable from a pullback. And the main difference between them is that a reversal keeps going and form a new trend, while the pullback ends and then the price starts moving back in the trending direction, or simply the price will continue with its previous trend. Reversals often occur in intraday trading and happen rather quickly, but they also occur over days, weeks, and years. Therefore, reversals occur on different time frames which are relevant to different traders. So, an intraday reversal on a 5-minute chart doesn't matter much to a long-term investor who's watching for a reversal on the daily or weekly chart. Yet, the 5-minute reversal is very important for an intraday trader. So, as a reversal trader, you are in essence a counter trend trader who is trading against the trend or the current market momentum. For example, let's say the market is in an uptrend, making a series of higher highs and higher lows. As a reversal trader, you look to sell in that uptrend. Or for example, if the market is in a downtrend, then as a reversal trader, you are looking to trade against the trend and the momentum. Reversal trading, especially the trend reversal trading, can be a profitable way to trade the markets. However, like any other trading strategy, there is a correct way and a wrong way to trade reversals. Before we talk about the correct way to do reversal trading, let me first explain how you should not trade the market reversals, or simply I'll talk about the mistakes that most traders make while trading reversals. The first and the most important point to consider is to not catch a falling knife. For those of you who do not know what is catching a falling knife, it means trying to enter a long position in a market that is crashing down. So let's say the market is dropping every day. You don't want to blindly enter a trade because you are a reversal trader looking to buy low and sell high. There is absolutely no sense in trying to catch a crashing market similar to a falling knife. And why is it so? Because if you are buying into the lows of the market, there is no logical place for you to set your stop loss. There is no support or market structure you can refer to, and there are no signs that the downtrend could be ending anytime soon. And most importantly, trends need time to reverse their direction, as we have discussed in the market trends as well as market structure videos. So avoid catching a falling knife. The second mistake that traders make is entering the first pullback, anticipating that it will be a reversal. Now, this is a common mistake that traders make, that is attempting to trade the first pullback itself. This means that you go long when you see the market rallies after a huge decline. But often, this type of a rally is only a retracement of the existing trend. And why do some traders always do this? This is simply because of the fear of missing out, or FOMO. And you don't want to miss out on the next move. Thus, you enter a trade as soon as the market shows any sign of reversal. Unknowingly, this sign is usually a retracement or a pullback of the existing trend, and the market will continue the trend, causing you to lose your money. Now that we have understood about what not to do during a reversal trade, let us look at how to approach reversal trades in the market. The first and foremost point is to have a reference point on your chart. Now, what exactly is a reference point? A reference point can be a trend, a consolidation, or an area of value like a support resistance, a trend line, a moving average, etc., where there is a chance for some sort of a price action. Now, after you have figured out a reference point, the second point is to wait for the market to reach that particular reference point. Now, no matter where the price is trading right now, for a price action trader to make any sort of conclusion with the prices, it has to be in an area where there is a potential interest from the side of the market participants. Or simply, the price should be at an area of value. Now, the third point to consider is regarding the trade entry. Now that the price has reached an area of value, you have to look for reversal candlestick patterns. You can use reversal candlestick patterns like engulfing candles or pin bars to time your trade entry. So you will enter a trade only after the market shows signs of reversal. However, you risk entering at a much higher price, which may lower your risk to reward ratio, but it gives you a higher win rate. Now, the fourth point is setting up a proper stop loss. When it comes to stop loss, you want to place it at a level that invalidates your trading setup. This means if your stop loss is hit, then the pattern is broken. There is no reason to stay in the trade any longer. So it is generally a good idea to keep the stop loss with reference to the area of value and the highs or lows of the reversal candlesticks by giving the ample buffer space to save yourself from pullbacks. The buffer space can be decided using the ATR indicator or with respect to your risk appetite. And the final point to consider is to set a conservative profit target. Now your exits depend on your goals. So what do you want to accomplish? Either you can capture a swing or ride a trend. So if you want to capture a swing, then you can exit the trades before the opposing pressure comes in. For example, if you are long in the market, then you want to exit your trade before the next resistance level or the swing high where the sellers can come in. And on the other hand, if you want to ride a trend, then you can trail your stop loss as the market moves in your favor. For example, you can trail your stop loss using a 20 moving average. Now that we have understood how to approach a reversal trade, I'm going to share with you 3 techniques which can help you identify reversal trades in the market. And as a reversal trader, you want to be smart about when you want to enter your trades. So here we go. The first strategy is the break of the market structure. We have talked about the different stages of market in the market structure video, and we also know how to identify a particular trend type from the market trends video. Now think about this. In a trending market, let's say an uptrend, the price makes a higher high and higher lows. And what do I mean by a break of the market structure? The break of market structure is the clue that the market is telling you that it is about to get weaker or simply it is about to reverse its direction. So in case of an uptrend, you have a break of structure when the price fails to make a new higher low or a higher high. So this is the first clue or the first evidence that the market is about to reverse lower. But there is no 100% guarantee that the reversal will happen. But it's an evidence given to you by the market that there is a break of structure and there is a good chance that the price could potentially reverse lower. Again, looking at the concept that I just shared with you, for an uptrend to reverse, we are looking for a break of the trend market structure. That is, what we are looking for is a lower high or a lower low which invalidates the uptrend setup. At this point, you have actually got a lower high, and when the price breaks below the area of support formed by the previous higher low, you will have a lower low. This tells you that this trend could be weakening and the trend could eventually reverse. Now the trend will not reverse all of a sudden because markets need enough sellers to bring the prices down, and so most often the market go into a phase of consolidation where the price will stay inside a range for some time and then it will show a trend reversal when there is an ample selling pressure available. This time when the price breaks out of the consolidation or the distribution stage and move lower is actually the best short trade entry for a reversal. In case of a tighter stop loss, you can keep the stop loss above the breakout candle high, and to be much safer and to avoid deep pullbacks, you can even place the stop loss above the consolidation range. The target in this case will be the nearest support level. Now let us consider this in case of a downtrending market. Again, we will apply the break of market structure concept. We can see that during a downtrend, there is a series of lower highs and lower lows. The break of downtrend structure comes when the price stops forming the lower highs and lower lows, or simply when you have a higher high because the price broke the prior resistance formed by a lower high, or if it formed a higher low. This again should give you a strong clue that this downtrend could possibly come to an end and the market could potentially reverse its direction. In this case also, the reversal may not come quickly. Instead, there can be a consolidation or an accumulation stage where the buyers can come in ample quantities so as to take the market higher. Here also, the trade entry would be when the price breaks above the accumulation stage and moves higher. You can keep a safer stop loss below the consolidation range, and the target can be set as the next nearest resistance level, or simply you can ride the trend until there is again a break-in structure. Now there is no such thing as guarantee in trading or in price action or in whatsoever. So if anyone promises you guarantees, then it's better to stay far away from them. This is why I like to use words like probably, likely, possibly. So keep that in mind. There is no guarantee for anything, and especially when it comes to trading. Now the second strategy is the higher time frame reversal structure. So in a market, it's very important to pay attention to where you are in terms of the big picture, or simply you should stay attention to what the higher time frame is doing. This is where the higher time frame reversal structure comes in handy. In this example, the price apparently breaks above the swing high and then it collapses lower below the support level. At this point, a lot of unaware traders would have bought the breakout on the upside only to get caught on the wrong side. And why is that? This is a chart in the 4-hour time frame. Now let's see the same chart on a higher time frame, for example a 1-day period. On the higher time frame chart, it is evident that most of the traders are buying the breakout into a previous support level as shown that could eventually act as a resistance, and thus it makes a very low probability breakout trade. This means that the traders are buying into a huge selling pressure. And what do you think will eventually happen? It's pretty much no wonder why the market reversed from the resistance level. This is what I mean by a higher time frame reversal structure. So what exactly are we looking at? In case of this strategy, we have to look for a higher time frame area of value like a support or a resistance where the prices can eventually reverse, and you can then take a trade entry on a lower time frame with the help of a reversal candlestick for confirmation. In this case, there was a false breakout and you can leverage the highs of this false breakout to place your stop loss. Now the third strategy we will be discussing is using moving averages. You can make use of moving averages for reversal trading. In this particular technique, we will use the longer term moving averages like the 100 moving average or 200 moving average with a positional trading perspective. We know from the basics that if the price is above the 200 moving average, for example, we should try to stay long, and if the price is below the 200 moving average, try to stay short on the market. Now the reason for this is quite simple. If you think about this, the 200 period moving average summarizes the price of the last 200 candles based on your time frame. So if the price is right now above the 200 moving average, it is telling you that the price has been trending higher. And similarly, if the price is below the 200 moving average, it is telling you that the price has been trending lower. This is a simple way to tell you what's the long-term trend on the particular chart that you're trading. Why is it a long-term trend on the particular chart of your trading? It is because you could be using a 200 moving average on a 5-minute time frame. That is not really a long-term trend because it's a 5-minute time frame, right? Likewise, it can be a 200 moving average on a daily time frame. Then that's a pretty long time frame. So it is actually the long-term trend of the chart that you are trading, and depending on what time frame you are looking at. So let's use 200 moving average and 1-day time frame for this particular example. Over here, the price is above the 200 moving average. So from the basic rule, you want to look for long opportunities in this market. We can plot an area of support, and every time the price comes into the area of support, it forms a price rejection that is validating your trading setup. But the key point to note here is that the price is actually forming a consolidation and it has tested the support level multiple times. And you know what that means from the simple concept that we have discussed about supports and resistances in episode 6. And it is exactly what happened. The price broke down the support level and even moved below the 200 moving average with great momentum. There wasn't any price rejection of any sort from both these areas of value. Now, we can have a short bias since the price is trading below the 200 moving average, and now we can look for opportunities to go short on the market. Now, this is how you can actually use the 200 moving average to give you a bias to know whether you should go long or stay short. And after you have identified your bias, then just reference to a market structure like a support or a resistance or even the moving average itself to kind of identify the area of value that you want to trade from. And sometimes the price will test the 200 moving average, which is actually an area of resistance, and if it turns out to be a false breakout of the highs, you can use the help of reversal candlestick patterns to take a reversal trade lower. Anyway, the 200 moving average is useful to help you find out the trend reversals and to identify the trade on the right side of the trend. Now, these are some of the techniques which you can adopt and backtest in the market conditions to check if they work for you. And if it does, the entry and exits can be decided based on your risk appetite and patience. The inside bar pattern is one of the most common candlesticks you will find on your charts. The inside bar is a simple yet powerful candlestick pattern. It can help you better time your trade entries with lower risk. And the best part, once you learn to identify this pattern, then you will very quickly see it everywhere. You will see it in many different markets and in all your different time frames. However, just because the inside bar forms often and can be easily identified does not mean you should be using it or trading it. So in this video, we'll go through exactly what the inside bar is and how we can use it successfully in our trading. What exactly is an inside bar pattern? The inside bar pattern is a candlestick pattern where the price forms completely within the previous candlestick. So for an inside bar to be considered valid, both the high and the low of the candlestick needs to be completely inside the previous candle's range. Most often or not, traders have this confusion around the wicks or shadows of the candlesticks. To clear this up from the start, the inside bar takes into account the candlestick's shadows or the wicks also. This means that the high and the low, including the wicks of the inside bar candle, must be within the high and the low of the previous candlestick. To simplify this even further, inside bar must have a high that is lower than the previous candle's high, and it should have a low that is higher than the previous candle's low, including the wicks. However, not all inside bars are created equal. There are different types of inside bar patterns formed in the market. Let us take a look at a few of these. The first type is an inside bar with a small range. So this is a standard inside bar where the range of the candle is small and it is covered by the prior candle or the previous candle. Now this tells you that there is an indecision or low volatility in the market. We will talk about this further in this video. The second type is the inside bar with a large range. Now you can have an inside bar with a large range. So this is still an inside bar as the range of the candle is covered by the prior candle or the previous candle. But in this case, you will notice that the range of the inside bar is too large. Now, depending upon the close of the inside bar, this could either represent an indecision in the market or a reversal in the market. Now let's see an example each for the long range candles of these types. As you can see, in the first category, there is a large inside bar with bullish close which shows signs of bullish strength. Moving on to the second type, it is a large inside bar with a small real body which shows signs of indecision. So depending upon the range and the real body, the inside bar can either represent an indecision or a reversal in the market. Now the third type of inside bar is multiple inside bars. So in this case, you have multiple inside bars together. This is a powerful pattern because it tells you that there is a low volatility in the market. To briefly talk about volatility, low volatility is associated with weak participation from the market participants, or it can signify weak price movements, while a high volatility is associated with elevated interest from the market participants. And we know the market volatility is always changing. That is, it moves from a period of low volatility to a period of high volatility and vice versa. So, when you see multiple inside bars together, it is a strong sign that the market is about to make a big move soon. Now, the fourth type is the Hikenashi pattern, which is a variation of the inside bar. This is actually a must-know pattern for all the traders because this pattern helps you identify a false breakout from the inside bar pattern. Imagine this situation. You identified an inside bar and you are hoping that the market will go higher, or simply you have a bullish outlook. So you go long when the price breaks above the highs of the inside bar. But the next thing you know, the market does a 180-degree reversal and collapses lower, and you are now in deep loss. Now this is what we call a Hikenashi pattern, which is a false breakout pattern. Now there are two variants of the Hikenashi pattern. The first type is a bearish Hikenashi pattern, which actually entices the bulls or the buyers into buying and then trap them and make them hit their stop loss. The second one is the bullish Hikenashi pattern, which actually entices the bears or the sellers into shorting the market, only to trap them and reverses the price against their position. Now the Hikenashi pattern can be traded the same way you trade an inside bar, which we will discuss as we move along this video. But this is a much more powerful strategy since the breakout traders get caught on the wrong side of the move and their stop loss would push the market in your favor if you take the right side of the trade. Now let us talk about the nature of an inside bar or the outlook of an inside bar in the market. The inside bar is actually an indecision candlestick pattern. The inside bar is formed because the price was not able to break either the high nor the low of the previous session or the previous candle. Now this shows us that, or this tells us that, neither the bulls nor the bears were in control during the session. This is a very important information when used correctly. However, it is important you note where the inside bar is formed and in what type of market. So if an inside bar is formed in a strong trend, for example, a trend higher, then it could be signaling a quick pause before the price continues on with the trend. And if the inside bar is formed at a swing point or even at a major support or resistance area, then it could be signaling that the steam has run out of the current move and the reversal is about to play out, or simply the market is about to reverse. Because this is an indecision candlestick, it is very important to pay attention to where and how this pattern forms. Moving on, let us look at the best time frames to trade the inside bar candle. As I have mentioned earlier, you will be able to find this pattern on all your time frames, from the 1-minute chart right through the monthly chart. However, just because you can find an inside bar on all your time frames does not make them all created equal, because inside bars formed on a higher time frame will hold more weight compared to inside bars formed on a smaller time frame. The reason for this is simple because of the time that goes into forming this pattern. So if price action is showing indecision and it cannot break the previous candlestick high or low on the 1-minute time frame, that shows us that for 1 minute the price was stuck. However, if we see that the price could not break higher or lower on the daily time frame and it formed an inside bar, then it shows that for a whole day neither the bulls nor the bears could gain control of the market. This leaves us with the conclusion that the higher time frame inside bar candle holds a much higher weightage than an inside bar on a shorter time frame. Well then, let's talk about the trading strategies. Now, there are many ways you can use the inside bar in your trading. You can use it to find new trades, and you can also use it to manage your trades. The three simplest and most common strategies to trade the inside bar are the inside bar breakout, the inside bar reversal, and the inside bar trend trading strategy. Let us start with trading the inside bar as a breakout. The first key to trading the inside bar as a breakout strategy is identifying a strong trend, either higher or lower. In this example, the price is in a strong trend lower, and because there is a strong trend, the inside bar represents a pause in the price action where some profit booking is being taken and the price is taking a breather. So when you are looking to enter with the inside bar breakout, you are looking to enter when the signal confirms itself. This happens when the price breaks the inside bar high or the low in the direction of the trend. In this particular example, we are looking to take a short entry when the signal confirms itself and breaks lower with the trend. Or simply, we are looking to enter when the price breaks below the previous candle low. But to be frank, I'm not a great admirer or a fan of the inside bar breakout strategy in particular. And it's simply because of the sheer number of false breakouts that this particular strategy can generate. Also, it is not a very smart move to trade an inside bar on a choppy range or consolidation because of its low probability trade. And why is it so? Because a range or a consolidation happens when the market is taking a breather or when the bulls or bears are in some form of indecision. So it does not make any sense to use an indecision candlestick to take a trade on a market where indecision exists. So personally, I would be well off using the other two strategies than the breakout. So moving on to trading the inside bar as a reversal. The key to inside bar reversal strategy is where the inside bar forms. To use the inside bar as a reversal, you need to see it formed at a swing high or a swing low depending on the market trend, and even at key price action levels or areas of values. And these levels are often the major support or resistance level. For example, the price approaches a support level, and we know that a support level is one where there can be higher chances for demand for the stock or where the buyers will be willing to enter a position. And if an inside bar was formed at or near the support, then it could be an indication that the price is looking to make a reversal back higher, and we could get long when the price breaks back above the inside bar high. But that being said, I prefer to wait for the price to make a reversal move first and then form an inside bar as shown in this case. Now what is the benefit of this? By doing this, I get to know two very significant things. Number one, that the buyers are in control at this period as they manage to make the first wave of reversal from the support level. Number two is that there is a volatility contraction due to the formation of an inside bar, and if the buying pressure could continue further, then it will manage to break out the reversal candles high and move higher. This is exactly when you can enter a long position, that is, when the price breaks out of the inside bar. This particular approach will let you enter the trade as the price moves in your favor. But on the downside, there is a possibility of a false breakout due to a bearish Hikenashi pattern, as we have learned earlier. You can avoid this trap by taking on a more conservative approach. You can wait for the breakout candle to close and enter the very next candle if the breakout candle managed to close above the reversal candle high. Now again, in this scenario, you risk missing a big move, or sometimes it can lower your reward to risk potential. So clearly, there is no right or wrong answer to it. So you have to find a trade entry which suits you best. When it comes to the stop loss, you don't want to set it beyond the lows of the inside bar, as the general rule states. And why is this? Because we have already learned that there is a variation of the inside bar, which is the Hikenashi pattern. This means if you set a stop loss just below the lows of the inside bar, you could get stopped out prematurely on a bullish Hikenashi pattern. So a better way to set your stop loss is using the ATR indicator. That is, you can place the stop loss 1 ATR below the low of the inside bar in case of long entry trades. This will ensure that your trade has more breathing room. So if you want to know more about the ATR indicator, you can watch the video here. Now, I will talk about setting the targets at the end of this video after we have discussed the next strategy. The third strategy is catching the trend. Previously, you have learned how inside bar allows you to catch reversals in the market. Now you will learn how to use it to identify trend trading opportunities. Now here's the main idea behind it. Let us reference with the use of a 20 moving average. In a strong uptrending market, the price is above the 20 moving average. So pullback in such a market will be shallow. So when the price stalls or stops after a pullback in form of an inside bar, let us say, you want to enter as soon as the price resumes the direction of the trend. Now here's how you can approach the trade when you are going long on the market. Now as we have mentioned, the price is in a strong trend, that is the price is above the 20 moving average. We have to wait for a pullback to occur. And if the pullback has occurred, we have to wait for an inside bar to form. And if the inside bar is also formed, then you can go long when the price breaks above the highs of the previous candle of the inside bar. Or you can wait for the confirmation. That is, wait for the breakout candle to close above the inside bar's previous candle's high so as to avoid being trapped by the Hikenashi pattern. For this trend trading strategy, you can consider setting your stop loss 1 ATR away from the 20 moving average since the market finds support at the 20 moving average. Now let us talk about setting targets for inside bar trades. Now your exits or targets depends on your goals. So you can either catch a swing or you can ride a trend. So if you intend to catch a swing, then you can exit your trades before the opposing pressure comes in. For example, if you are taken a reversal trade from the support and you are long on the market, then you want to exit your trade before the next resistance or the swing high. Now if you want to ride the trend, then you can trail the stop loss as the market moves in your favor. For example, if you have taken the trend trading approach, you can trail your stop loss using the 20 moving average. And when the price breaks below the 20 moving average, that is when you should exit the market. Now when trading the inside bar pattern, by entering above or below the breakout of the pattern using any of these strategies, I would recommend you to go with the small ranged inside bar breakouts. Now there are a few reasons as to why this is important. The first benefit is that you can place a very tighter stop loss. You can reference the low of the inside bar to set your stop loss as we have discussed, and the smaller the inside bar, the smaller the stop loss is. And with a smaller stop loss, you can put a larger position size and still keep your risk constant. The second benefit is that the price will move quickly in your favor. The market moves from a period of low volatility to a period of high volatility and vice versa. So if you trade a small ranged inside bar, it means the volatility is low and there is a very good chance that it could expand or break out in your favor. This means you could get a good reward to risk potential on your trade in a short period of time. I hope this makes sense to you. As a closing note, even if you find the inside bar on all your different time frames, the higher the time frame, the more weight the pattern holds. Because this is an indecision pattern, it is absolutely crucial as to where and how it is formed. So, you need to look at and follow the price action that is formed around the inside bar to successfully start using them in real market conditions. And as always, don't forget to learn about the pattern in detail and backtest it so that you are comfortable while using it in the market. In the fourth episode, we have talked about the different candlesticks and what each of them had to say with regards to the market participation. And one of the main candlesticks of our discussion was the pin bar candlesticks. The pin bar is one of the most popular reversal candlestick patterns. You can use a pin bar on all your different time frames and it can be traded across many different markets, making it a very flexible trading candlestick pattern. Most importantly, the pin bar candlestick is a reversal pattern and it can often help you find when a new swing, either higher or lower, is about to occur. Let's hop into a more detailed study about the pin bars. So what is a pin bar candlestick pattern? If you remember, a pin bar is a candlestick that has a very large shadow or a candlestick wick with a small real body. The shadow of the pin bar is at least 2 times the size of the real body. The tail or the shadow of the pin bar shows the area of the price that was rejected, and the implication of it is that the price will continue to move opposite to the direction the tail points. Now this pattern can be bullish or bearish depending upon where it occurs and how it is formed within the price action. The example here shows a bearish pin bar. The pin bar is formed with the price trying to break higher. In this particular market, the bulls are in control. But as soon as the bearish pin bar was formed, it shows that the bears have entered the market and are looking to take the price lower with a reversal. And this is exactly why the large candlestick wick is created. It shows that the higher prices were rejected and the bears are trying to regain control after the initial break higher. Similarly, A bullish pin bar shows rejection of lower prices. The large lower wick shows the bears were in control earlier, but eventually it was overcome by the bulls, and now the bulls are dominant and the market could reverse higher. Now the most important point is that the key to high quality pin bars is where they form in the market. As we discuss more about pin bars in this video, we will understand why the best pin bars are found at the key market levels or within the obvious trends. Let us try to understand the two pin bar types in greater detail. Let us start off with the bullish pin bar. Some of the highest quality pin bars are when there is an obvious trend in the market. In this particular example, the price is moving in a clear trend higher. We can see from the price action that the price is making regular higher highs and higher lows with this uptrend. For a bullish pin bar to make sense to a price action trader, we want to see it formed at one of these swing lows with the trend. Now the reason as to why the pin bar should be formed at the swing lows is that pin bar is actually a reversal signal, and we are looking to enter the bullish pin bar and make a profit as the price reverses higher with the trend. Or simply, we want to enter when the buying demand starts to kick in, and in addition to that, we want to trade with the trend. In this particular example, the price forms a bullish pin bar at the swing low within the trend higher, and the rejection is quite strong, which will actually strengthen the bullish perspective even more. So in this case, we can enter a trade straight after the pin bar has finished forming, or we could use additional confirmations. A confirmation type of entry is where we are looking for the price to break higher and above the pin bar high. And when we see the price breaking above the pin bar high, we can enter long. Now let us take a look at the bearish pin bar setup to clear things even more. As mentioned, the pin bar can be both bullish or bearish depending upon where and how it forms with respect to the price action. The difference between the bullish and the bearish pin bar is that the bullish pin bar has a wick or a shadow rejecting lower prices, while the bearish pin bar has a wick rejecting the higher prices, which is a sign that the bears are more dominant over the bulls. Now, the other great time that you will find high probability trades with this candlestick in addition to a trending market is when the price is rejecting a level in the market that is of importance or an area of value. Now, these can often be the key support or resistance level or dynamic levels like the moving averages. In this example, the price moves higher into a key resistance level. We can see that the price rejects from this resistance level and forms a bearish pin bar. This tells us that the resistance level has held and the price may now be looking to sell off lower. And then we can either enter the trade the very next candle, or we can wait for the confirmation. That is, we can wait for the price to break below the lows of the pin bar candlestick. Moving on, let us find out which are the best markets to trade the pin bar. Now, the best markets to trade pin bar strategy are markets where the price has a solid amount of volatility, or the markets with a high volatility. The more the price movement and volatility, the more opportunities you will have to trade the pin bar, and also the bigger potential for large winning trades. But markets such as individual stocks that can often have large gaps like gap ups or gap downs are not ideal for pin bar trading. Instead, the markets which are fast and free-flowing with smooth price action is actually good for pin bar trading. So markets like Forex, crypto, etc. are the best candidates for this particular strategy. In trading, mistakes are bound to happen. Sometimes it may be due to lack of knowledge, and other times it may be due to how we conceive an idea. That is, if we understand a particular idea in a different context, that will lead us to confusion. So I will talk about some of the mistakes that you should avoid while using the pin bar trading strategy. The first and foremost mistake is to expect market reversals because of a pin bar. A trend, either uptrend or downtrend, will not reverse just because there is a pin bar on the chart. It takes more than a single candlestick to reverse a trend. Sometimes even a major news release has difficulty in reversing a trend. So what more of a pin bar? We have talked about the market structure or the different stages of the market and why and how they are formed. So you can watch the second episode to get more insights on this topic. So, if you spot a pin bar against the trend, it does not necessarily mean a trend reversal is about to play out. The odds are that the trend will continue. The second mistake is giving too much attention or interest to pin bars. Now, we have learned that pin bar represents price rejection. But here's the important thing. Price rejection can come in different forms and patterns, and not just in the form of pin bars. So if you focus only on pin bars and reversals associated with pin bars, then you will miss out a lot of other trading opportunities in the market. Now the most important mistake of all, considering all pin bars to be equal. The point is, if you see a strong momentum on the upside followed by a small bearish pin bar, it is likely to be a pause in the price action as the bulls are in control of the market. And on the same note, if you see a weak momentum on the upside followed by a huge bearish pin bar, it is likely to be a reversal since the preceding price action tells you that the bulls are getting weak. So it's clear we should not treat all pin bars the same because they are actually not. And remember, the bigger the pin bar relative to the previous candles, the stronger the price rejection. It is always a good idea to compare the pin bar with the previous candlesticks to understand the price action logic. Now let us hop on to the pin bar trading techniques, starting with trading the pin bars with the trend. One of the simplest and most effective ways to start stacking the odds in your favor is to trade in line with the obvious trend in the market. When trading with a clear market trend, you are trading with the current flow and not trying to push against it. So the trick when using pin bar and trend trading is to look to enter from areas of value and important swing points, which are swing highs or swing lows. In this example, the price is in a clear trend higher, and so we will start looking for a bullish pin bar to get long. And when the price makes a swing low due to a short-term profit booking into an area of value like a trend line or a moving average or even a swing level, and then forms a bullish pin bar reversal candlestick rejecting the lower prices, we could look to enter long trades. We could either go long as soon as the pin bar has formed, or we can wait for a confirmation to enter when the price breaks above the pin bar high. In case of stop loss, we can place the stop loss 1 ATR below the swing lows or the trend line or the moving average as amber buffer, or you can even place the stop loss below the lows of the pin bar candlestick in case you want a tighter stop loss. Now the target can be set as the next swing high or the nearest resistance level, or you can ultimately ride the trend and exit when the price breaks out of the uptrend structure. Now there are a few advantages by trading with the trend. Number one is that you don't require a precise entry to make a good profit. Secondly, you have better odds for the trade to work out as you are trading with the market flow. And finally, you have a greater profit potential as the impulse move is stronger than the corrective move. Moving on to the second strategy, trading pin bars from an area of value. Take this example where the price moves higher into a key resistance level. We know as a thumb rule that resistance is an area of value where sellers will be looking to short the market, or there will be a larger supply for the stock than the demand. So when we see a price rejection from the market level and it forms a bearish pin bar candlestick, this is a clue that the resistance level has held or the sellers are active, and this is an indication that the price may now be looking to sell off even lower. The important point to note here is that pin bars are reversal candlesticks which can help us make a trade entry but can't guarantee us a reversal. Now since there is a strong price rejection from the resistance level, we can either take a short entry on the very next candle or we can wait for a confirmation. The confirmation in this case is when the price breaks below the lows of the bearish pin bar candle, and the stop loss for this trade would be above the highs of the bearish pin bar candle with a suitable buffer using the ATR indicator. And finally, the target can be set as the nearest swing low level or the nearest support level. Now, some of the benefits of trading at a support or resistance level are that you are trading from an area of value. Secondly, it tells you when you are wrong. That is, if the reversal fails, your stop loss will be hit and you will be out of your trade. And finally, it improves your winning rate as well as improve your reward to risk because of the area of value and also based on the degree of rejection from the level. Now the third strategy is using a combination of moving averages and support resistance levels. So in strong trending markets, the price is unlikely to pull back towards the trend line or a moving average, or simply the pullbacks are shallow. Thus, you can look to trade from a 200 moving average. Now, by a general rule of defining the market trend, if the 200 moving average is pointing higher and the price is above it, then the market is on an uptrend. Now, on an uptrend, find key support and resistance levels using a higher time frame, or you can even use a more responsive 20 moving average. Then we have to wait for the price to come to an area of value, which could be a support resistance level or a dynamic support resistance level like the 20 moving average. And if the price comes to the area of value, and when you see a bullish pin bar or a price rejection from this area of value, then you can go long. You can take a long entry on the very next candle, or you can wait for the break of the highs of the pin bar so as to enter with a confirmation. If you are long, you can place the stop loss below the low of the pin bar or 1 ATR below the pin bar low. Now, if the price goes in your favor, then you can take the profits at the nearest swing high level or the nearest resistance level, or you can even use the 20 moving average as a trailing stop loss and exit when the price breaks below it. Now, on a closing note, pin bars will show up in any market condition on all the time frames. So be sure to understand the prerequisites and practice identify and trading them on a demo account before trading them with real money, because practice makes you perfect. Traders have always benefited from massive jumps in asset prices, especially during volatile market conditions. So it is our responsibility as a trader to understand these massive jumps in asset prices, or simply the gaps formed in the market, and then learn about them, analyze them, and finding ways to trade them in the market. So what exactly is a gap? The difference between two consecutive candles closing price and opening price is called as a gap, or simply a gap is an area of discontinuity in the chart where the price of the asset either falls or rises from the close of the previous day. A gap occurs when the prices skip between two trading periods, that is, skipping over certain prices, and so it creates a void on the price chart. Or simply, these are areas on the chart where no trading activity has taken place. Now you will have a question in your mind, why do gaps occur in the market in the first place? Now there are a few reasons as to why gaps occur in the market. Let us look at the reasons one by one. First of all, gaps occurs due to an imbalance between the demand and supply. The gap up, for example, is because of the aggressiveness of buyers, which means that there are more buy orders in the market. Or simply, the demand is greater than the supply, which will boost the prices to go up. Or in other words, the price will gap up. Similarly, a gap down is because of the aggressiveness of sellers, which simply means that there are more sell orders, or simply the supply is more than the demand, which cause the price to gap down lower. So in short, gaps occurs at levels where there is a supply and demand imbalance. The second reason due to which gaps occur are due to the overnight sentiments of the market participants or due to any big news. Gaps usually occur when there is a fresh news or a big announcement that will lead to change in the market fundamentals, usually when the markets are closed. So when such a news spreads, there is a flood of buyers or sellers waiting to buy or sell depending upon the nature of the news. And finally, sometimes the smart money or the big institutions try to skip the important support and resistance level. That is, for example, if they are bullish on a particular stock, they will gap up the price above the supply zone where they could have faced a potential selling pressure. Another important point to note about gaps is that gaps can act as supports or resistances. So in case of a gap up, the gap can actually act as a support zone, and during a gap down, the gap can act as a resistance zone. We will use this particular idea further up in this video. Now another idea which is worth mentioning is the idea of gap filling. Now gap fill refers to the price retracement back to the previous day closing price. Now you can ask the question that do all the gaps get filled? The simple answer to this question is a no. That is, not all gaps get filled. However, 90% of gaps eventually get filled. The problem that you will have if you are making trades thinking that a gap will get filled every single time is that even if it does get filled, it can take a very long time. While most gaps get filled quickly, some gaps will not be filled for months or even years. So if you are looking to make trades aiming for the gap to get filled, then you need to keep in mind that not all the gaps will fill and some of them will take a very long time. Now, all the gaps are not the same. There are different types of gaps, and actually the gaps are divided based on the context in which they appear. So I'll talk about 3 of them. Number 1 is the breakaway gap or the breakout gaps. The breakaway gap means breaking the important support or resistance level or a significant trend line in the form of a gap. The breakaway gap actually appears after the completion of an important pattern like a price in a consolidation range or a continuation or a reversal pattern. So the main logic behind breakaway gap is that the smart money knows exactly where the support and resistance areas are. Let us say, for example, if the smart money is bullish and higher prices are anticipated, the smart money will certainly want a rally. But the problem is how to avoid the old resistance which could trigger some selling pressure. So what they will do is that they will gap up through the old area of supply as quickly as possible as a way of avoiding the resistance. Now, after the breakaway gap has occurred, we have a clear sign of strength. Now, the smart money does not want to have to buy the stock at higher prices because they have already bought their mean holdings at lower levels during the consolidation. And they also know that a breakout above the old resistance area will create a new wave of buying in the market. And how can they be sure about this? Number 1, many traders who have shorted the market will now be forced to cover their positions by buying back the stocks. And then there will be a second group of traders who will be looking to buy the breakouts. And finally, there will also be traders in the market who may feel they are missing out on a big opportunity and they will be encouraged to start buying. Most often or not, the breakaway gap will not be a trap-up move or a false breakout because high volumes will be supporting the move often. Now coming to the second type of gap, it is a runaway gap or a measuring gap. In this case, the price move have been underway for some while and somewhere in the middle of the move, the prices will gap up. And this type of gap up is called as a runaway gap. So in case of an uptrend, it is a sign of the continuation of a trend. And also in case of a downtrend, it is also a signal that the trend will continue. Moving on to the third type, which is an exhaustion gap. These are generally weak gap ups or gap downs. So it can be a weak gap up to the resistance or a weak gap down to a support. This price action is actually designed to trap you in a potentially weak market and into a poor trade and thereby hitting your stop losses. And most often or not, it will form a false breakout or a false breakdown in the market. Well then, let us figure out how to trade the gaps successfully. There are several ways to leverage gaps in the market to your advantage. In this episode, however, we will talk about the idea of breakouts and reversals with respect to market gaps. These strategies are based on 2 types of gaps, with the open price depending upon the highs and lows of the previous trading section or the previous session's range. So it can be an outside gap or a full gap. Now this happens when the market opened outside the previous day range. That is, the candle opened outside the previous day high or the low for a gap up or gap down respectively. And the second type of gap is an inside gap or a partial gap. In this case, the market opened inside the previous day range. That is, in case of a gap up, the candle opened above the previous day close but not above the previous day high. So there are 3 main factors we have to monitor to determine whether the gap is real or a trapped gap. So these 3 factors are the volume, opening price and the pullback to a particular level. Let's talk about the volume briefly. It is important to watch the volume carefully when determining if a gap is valid or not. So for example, if a stock gaps up, and the volume is also high and also the price remains above the opening price after the morning pullback, it is an excellent sign that the stock can further go on the upside. In addition to volume, you can also make use of an indicator called the VWAP or the volume weighted average price, which plots the average price adjusted for volume on the chart, and it is fairly very easy to make use of. Also, the VWAP assigns more weight to the price points with high volume. To talk about VWAP briefly, VWAP is typically used with intraday charts as a way to determine the general direction of the intraday prices. It is similar to a moving average in that when the price is above the VWAP, prices are rising, and when the price is below the VWAP, the prices are falling. But for the sake of this video, we will go with the conventional approach of following the volume bars for confirmations. Now, talking about the time frames, the strategies that I am about to discuss are based on a smaller time frame, that is the intraday time frames, particularly on the 5-minute chart, and considering the price data from 2 consecutive days where the gap has occurred. So to begin with, I have to plot the previous day's high and lows and also bring up the volume indication on the chart. Then you have to see if it is a gap up or a gap down, and you have to figure out if the gap was a partial gap or a full gap. Now, after finding out these prerequisites, you are ready to take either the breakout approach or the reversal approach. And the most important thing of all, do not trade the first hour after the market open in case of a gap opening, because we need to understand the price range or the price action happening during such a volatile opening so as to implement our strategy with some amount of confidence. As I have mentioned earlier, there are 2 types of gaps, partial gaps and full gaps. And these can be further categorized to partial gap ups and gap downs and full gap ups and gap downs. So, for these 4 category of gaps, we can actually implement a long trade and a short trade, which will leave us with 8 different strategies to use with. But at this point, I will pinpoint only 4 strategies which has a higher win rate than the other 4 strategies. And let me make this very clear that sometimes the trades won't work out as we have planned, and it is better if we opt to not trade under such situations. Starting off with trading the full gaps. Let us talk about a full gap up, that is, open price of the gap up candle is higher than the previous day high. We have to note here that the previous day high is an important price level which can act as a support level for the prices. It can trigger a buying pressure in the direction of the gap up. So in this particular situation, we have to wait for the prices to form a range during the first hour of the market open, and then if we manage to find a pullback to the previous day high, which is the demand zone here, then we will look for a continuation trade on the upside direction when the price actually breaks above the opening range high or the high that was formed during the first hour of market open. We also have to see if the volumes are favorable or high enough, which will help to strengthen our trade confirmation. We can enter a long trade above the high of the range, and we can keep the stop loss below the previous day high level with a suitable buffer. And in case if the open range high is very large, we can actually enter a trade above the range, keeping at least 1.5:1 risk to reward and placing the stop loss below the highs of the range or below the breakout of the range candle lows. Now you may have a doubt in your mind. What if the gap up is too large? That is, if the price opened far above the previous day high, which means it is far away from any area of support, and in such a case, the probability of the price retracing back to the support level or the previous day high level is very low. So, as a price action trader, we can't initiate any reasonable trades as there is no critical price levels where we can find a trade entry. And of course, if there is any market support and resistance level near the 1 hour range after the market open, then we can take a breakout or a reversal approach based on price action. Other than that, it is better as a price action trader to stay away from such a huge shift from the price level, as the win rate of the trade can be low. I'm not saying that it is not possible to trade such huge gap ups. Of course, it is possible with technical indicators like VWAP, which we will talk about in the technical analysis course. But on the scope of a price action trader, it is better to stay away from such setups. Moving on, let us talk about a similar case, but it is about a full gap down. That is, the price opened below the previous day's low. In this case, the previous day low will act as a resistance level where there could be potential sellers coming in and push the price lower. So in our approach, we will wait for the first hour so that the volatility will cool down, and then if we see a pullback of the prices back to the previous day low, which is a potential resistance level. Now you have to mark the low price of the range so formed during the first hour, and if the price manages to break below this range low with a high amount of volume, then we can enter a continuation trade in the direction of the gap down. We can take a short entry below the breakout of the range low, and we can place the stop loss above the previous day low, or in case if the range is too large, we can enter a short trade with a predefined reward to risk of at least 1.5:1, keeping the stop loss just above the breakdown of the range candle low. Similar to the previous case that we have discussed in case of a full gap up, in case of a full gap down, where the open price is far from the previous day low, which is a potential resistance level, the probability of a pullback or retest back to the resistance level is very low. And it does not make any sense as a price action trader to be trading without a critical price level to rely upon. So better avoid trading when the price does not respect any support or resistance levels. Now these are the two full gap trading strategies that I prefer using in contrast to their counterparts, which are the full gap up short trade and a full gap down long trade. Now the idea to trade the other two techniques is based on the strength of the pullback, which means if the pullback is very strong and breaks through the level with high volumes, then we can think about implementing these two strategies. We can research more about the other two strategies if you are curious enough. Moving on, let us talk about the two partial gap trading strategies. One of the most important points that we have discussed earlier was that a gap can act as a support or resistance level. When price does move in and close the gap or fill the gap, it will often bounce away and act as an area of supply or demand. So there are two potential levels to consider out here. The first one is the previous day closing price, which can oppose the prices. So is the opening candle of the particular day under consideration. So both these levels are potential levels for price reversal. So instead of considering both these levels as separate entities, we will look at them as a zone or area of price action. Now starting off with a partial gap up, that is, open price is above the previous day close but still below the previous day high level. Now when a market gaps up, the gap can act as a support level for any pullback. The pullback tests the gap with lighter volume, which tells us that the price does not have enough legs to get past through the gap or break down below the gap. Instead, the gap becomes a support and there is a potential price reversal possible towards the upside, and any bullish signal that is triggered is our buy entry. So it can be a bullish pin bar or a bullish engulfing pattern, etc. We can also look for a rise in the volumes when the prices starts to rise. We enter long at this bullish signal. That is, we can wait to enter above the reversal candlestick high, or for an even more conservative approach, we can enter when the price breaks above the day's high level formed so far. But this particular approach of entry doesn't make sense if the range high is very close to the previous day high. Then there can be potential selling pressure and your trade can go against you. So make sure to maintain a good reward percentage and keep an eye on the important levels where the opposing pressure could potentially come in. We can place the stop loss just below the gap zone and we can fix a reward to risk of at least 1.5:1, or you can even keep the target as the previous day high level. So the benefit of using this strategy is that gaps fill 90% of time. So this is a popular trading strategy. The second strategy is when there is a partial gap down. That is, open price is below the previous day close, but it is still above the previous day low. When a market gaps down, then the gap acts as a resistance level for any pullback. If the pullback tests the gap with a smaller volume, it tells us that the price does not have enough strength to break through the gap or break out above the gap. Instead, the gap becomes a resistance level and there is a potential price reversal possible towards the downside, and any bearish signal such as a bearish engulfing candle or a bearish pin bar gets triggered, it is our opportunity to short the market. We will also have to check if there is high enough volume associated with this particular move. You can enter a short trade below the bearish confirmation candlestick and place the stop loss just above the gap for safety. Or it is much better if you keep a predefined reward to risk beforehand as a part of risk management. Now these were the two partial trading strategies. The two others are the partial gap up with a short entry and the partial gap down with a long entry. In these strategies also, volume and pullbacks back to the gap regions is the key. That is, if there is a strong enough pullback assisted with strong volume break through the gap zone, then we can think about utilizing these techniques. You can check them out yourself if you want. You can also notice that all the strategies that we have discussed, we were actually taking a trade in the direction of the gap and not against it. And finally, It is up to you as a trader to backtest these strategies on the chart and find out if you can actually implement successfully in your trades.
I know many of you have seen a lot of videos on chart patterns on YouTube and how to trade them. But most of these videos don't tell you why you should trade them, and in fact why these chart patterns actually work in the market. So this is going to be one of the most comprehensive courses on chart patterns out there. Many professional traders even sell paid courses on chart patterns that are worth thousands of rupees with very little content. But guess what? This course is completely free of cost and is exclusively for educational purposes only. So share it with all your fellow traders and friends. And if you are new to the channel, consider subscribing to the channel and also enable the bell icon so that you won't miss out on any upcoming videos. Now the working of these chart patterns are quite simple. Chart patterns work by representing the market's supply and demand. This causes a trend to move in a particular way on a trading chart, forming a particular pattern. So when a trader looks at the price chart of a stock or an index, it can often appear to be completely random price movements. This is often true, yet within those price movements are patterns. So chart patterns are geometric shapes found in the price data which can help a trader understand the price action as well as make predictions about where the price is likely to go. However, chart pattern movements are not guaranteed, and simply trading the chart patterns is not a sure shot way to success in the markets, and it is better used alongside with other methods of market analysis. So in general, there are three types of chart patterns. There are continuation chart patterns, reversal chart patterns, and neutral chart patterns. The topic of discussion in this video are continuation chart patterns. I will talk about 5 most common continuation chart patterns and why and how they are formed and how to trade them with the proper entry, stop loss, and target setups. So if you don't know what continuation chart patterns are, as the name suggests, these patterns signal that the existing trend in the market will most probably continue, or in simple terms, it predicts that the market will continue in the same direction after the end of the pattern. Now, most of these continuation patterns are formed as consolidations in between trends. So it's like market taking a tea break because of exhaustion and getting back to work after refreshment. We will be discussing 5 patterns and their subcategories. We will start off our discussion with flag patterns, followed by pennants. Then we will talk about the ascending and descending triangles. Further, we will discuss about the rectangle patterns. And finally, we will wind up with cup and handle and inverted cup and handle patterns. Before moving on to the patterns, let me make something clear upfront. It's none other than time frames. All these patterns that I am going to talk about forms in almost all the time frames, from intraday to swing to positional time frames. All these patterns work better as the time frame increases because it takes more time to form and therefore more people are aware of them. Moreover, the time frame to trade these patterns will depend on your trading style, the duration you want to hold positions, and your expectations. So I have already made a video on how to select the appropriate time frames to trade. So you can watch that video to know which time frame to choose depending on your trading style. Okay then, let's get started. The bullish flag or the bull flag, as the name suggests, forms during a bullish trend. The bull flag starts with a strong, almost vertical bullish trending move, which then stabilizes and turns into a minor bearish correction with parallel tops and bottoms, which are important levels of supports and resistance. Now, there are 3 components to any flag patterns that make it. So I am going to give you a few hints to correctly identify the bull flag. We have to look for a preceding up move or an uptrend, which makes a flagpole. As we know that the bull flag pattern forms during a bullish trend. This means that the candle's range is more bullish than usual and they tend to close near the highs. So it is a strong indication of buying interest in the market, and it also signals that the bulls are dominating the market. Now after the strong move higher, the market needs to take a break. Now this can be seen as a profit booking phase where the initial buyers are looking to book some of their profits. So here's where you can expect a potential bull flag to form as the market does a pullback. Now the type of price action that is exhibited in the pullback is what separates a flag pattern from a normal pullback. Now what you are looking for is a shallow pullback that consists of small ranged candles compared to the earlier strong bullish move, or it can be seen as a group of indecision candles after a strong bullish move. Now this tells you that the sellers are struggling to bring the price down and that the buyers are still in control. Now if you see a steep pullback with large range of candles, then it's probably not a bull flag pattern. Generally this retracement ends below the 38% threshold of the original trend as indicated by the Fibonacci. So in general, it may not be considered as a flag pattern if the retracement goes below 50% of the pole. Now the tighter this range, the more likely the market will break out higher. Now that we have learned how to identify a bull flag, we can discuss how to trade the flag pattern. So I will discuss the entry methods, where to place the stop loss and how to set the targets. Now starting off with the entry criteria, as it is a bullish continuation pattern, we are only interested in the break above the resistance line. So you can take a long entry following a breakout of the level. That is, you can enter at the moment when the price breaks above the resistance trend line, or you can look to buy above the high price of the breakout candle after it closes. Now the second method is to wait for a pullback or a retest back to the breakout level and then take a long entry when the price moves higher or when the price moves above the breakout candle high. Now you may be probably wondering which one is a better method. Well, there's no best approach. Let's say if you enter the trade as and when the breakout happens, it could potentially result in a false breakout also. But if it is a real breakout, it's the best possible price you can get. Alternatively, if you wait for a close above the highs, you will reduce your chances of a false breakout. But if the breakout is too strong, you will end up entering at a much higher price. The same is the case with waiting for a pullback or a retest, which may not happen often if the market is trending strongly. And as a matter of fact, you will miss out on the trade completely. So it is up to you to decide your entry strategy and continue practicing it over a large number of trades. And above all, it is always recommended to confirm the validity of a breakout using volumes and other indicators. So a higher than average volume can validate a breakout most of the time, as it shows the interest of the market participants. And low volume breakouts are most likely to fail. Using momentum indicators like MACD and RSI can also help you identify a true breakout. I have already made videos on all these topics, so if you want, you can check them out. Let us now focus on the criteria for setting stop losses. So how to set your stop loss when trading the bull flag pattern? Now you don't want to set your stop loss at obvious levels like supports and resistances, swing highs or lows, etc. And why is that? Because you can get your stop loss 100 easily. It is as obvious a level to you as it is for others, including the smart money. So how do you get a proper stop loss setup? It's simple. Your stop loss should be at a level that, if crossed, invalidates your trading setup. So what are we trading here? We are trading a bull flag, and the pattern becomes invalid when the price breaks and closes below the bottom trend line support. So you have to keep your stop loss below this particular support level. But there are still chances of long wicks which can take out your stop loss and then move higher in the desired direction, which can be pretty annoying. So to be extra safe, you can give your trades more breathing space by setting your stop loss a particular distance away from the market structure using an indicator like ATR. So once you identify the swing low of the bull flag pattern, set your stop loss 1 ATR below the swing low level. And now let's learn how to set target for bull flag patterns. Now there are many ways you can cash in your winners. And one of the most common approaches is to have a predetermined profit target based on the length of the flagpole. This method is also known as the price projection method. Let's measure the length of the flagpole from the bottom of the bullish price move to the top of the resistance level, and then project this length from the breakout point above the resistance trend line. And this will be your profit target in the future. An alternate method is to choose to trail your stop loss until the market takes you out of the trade. Why is this a better option? Think about this. The bull flag pattern usually appears in a strong trending market or just after it breaks out of a range. In such market conditions, there is a lot of potential for the trend to continue, and the only way to ride it is to trail your stop losses. Now the question is how to trail your stop loss in the best possible manner. Well, you can use a tool like moving averages or Chandler's stop to trail your stop loss and only exit the trade if the market closes beyond it. Moreover, it is much better if you use a combination of both the projection method and the trailing stop loss method so that you can predict the future move beforehand using the price projection method so as to lock in part of your profits there and then ride the rest of the position using the trailing stop loss and thereby not impacting your psychology and avoiding any potential losses. Now moving on, in the market there are numerous opportunities that are available for trading bull flags. But if you were to ask me to select a few, I would choose 4 different scenarios to trade with a bull flag so that my risk to reward is satisfactory. Now these 4 scenarios includes number 1, the formation of bull flag during a level breakout which is followed by a primary pullback. The second scenario is when the flag formation occurs during an uptrending market which further signals a trend continuation. The third scenario is when bull flags occurs inside a range market, and the final case is when the bull flag occurs in a downtrend signaling a trend reversal. Now the entry, target and stop loss criteria are the same for all these cases, so I won't be discussing them individually for each case. Let us take a look at the first case. This happens when the market breaks out of a range and then does a pullback for the first time. This is one of the best times to trade the bull flag pattern. And why is that? Because when the market is in a range, it will eventually have to break out. And besides, the longer it stays in a range, the harder it will break. So what we are concerned about here is a resistance breakout where we can expect a bull flag to form. So when the market finally breaks out, the traders who missed the breakout move can wait to enter the market at the first indication of a pullback. These primary pullbacks usually have a shallow retracement as not many traders want to trade against the strong momentum. And this presents a pullback trade with a very high probability. So if I were to explain the process in a rather simple fashion, it would go something like this. First of all, you have to identify a range market or a market testing a resistance level for quite a while. Now let the market break out of the resistance level. Now you have to wait for a bull flag pattern to form in the form of a primary pullback. Now once you find such a formation, you can look to take a long entry on the break above the highs. Has it ever occurred to you that you think the price is too high and it would be better to wait for the price to retrace to the support or back to the breakout level before you go long? But the next thing you know, the market continues to break new highs and you are left on the sidelines regretting your decision. So have you learned something from this? To put it simply, in a strong trending market, it's far easier to buy breakouts than to wait for the price to pull back, which rarely occurs. In such a market, you can use the bull flag pattern as an entry trigger. Here's how you can trade bull flags in a trending market. Now the first step obviously is to find the market trend. You can look for strong trending market with the use of moving averages. For example, for short-term trades, you can make use of 20 symbol moving average, and for swing or positional trading purposes, you can make use of 50 or 200 period moving averages. Now, for this case, let us consider a 20 moving average. When the price trades above the 20 moving average predominantly and is sloping higher, we can conclude that the market trend is strongly bullish in a short-term scenario. Now you have to wait for a bull flag formation to develop in the form of a pullback. Now once you identify a pattern, you can look to take a long entry. Now as I have mentioned earlier, the same entry, stop loss and targets can be used for this purpose. Predominantly, you can expect a bull flag to form after a breakout or during a strong trend. However, there are times when a bull flag pattern can form when the market is in a range and at a resistance level. So in one of my price action videos, I have talked about the concept of breakouts with build up near a resistance or support level. You can find the video on the I button if you want to learn more about it afterwards. Now the same concept applies here. A build up near a resistance level happens because there are no sellers stepping in or the buyers are willing to buy at higher prices. Now whatever is the case, this is a sign of strength and the market could break out higher. So how do you identify such an opportunity? Primarily, you have to identify a market which is in range. Then you have to wait for a flag pattern to form near the resistance level in the form of a build up. Now as always, you can trade the break above the build up or wait for the market to close above the resistance level. There is no change in the entry, stop loss and target criteria for this case also. Now if you are probably thinking, what the hell this dude is talking about? Just a few minutes ago, you said that bull flag is a trend continuation pattern. Now why are we looking for it in a downtrend? Yes, there is no denying that the bull flag is indeed a trend continuation pattern. But what if I tell you that there is a way you can profit by using the bull flag as a trend continuation pattern even on a downtrend? Now this method has to do with the market structure. So if you don't know about the market structure, you can watch it from my price action playlist. It's a rather simple method. You have to look for a few things before you proceed. First of all, the price must close above the downward trend line resistance. Now we are talking about a break in the downtrend structure. Then, if the price forms a bull flag above this trendline resistance, hola, you have got a jackpot trade. What you're doing here is trading between an ending downtrend and a potential starting uptrend. You can benefit tremendously if you are able to catch the uptrend from the beginning itself. Now the entry, stop loss and target conditions will remain the same, but I suggest you use a trailing stop loss such as a 20 period moving average, since we are taking sort of a contrarian position just to be safe. Now a bear flag pattern is just the opposite of a bull flag pattern. It is yet another continuation chart pattern, but the bear flag signals that the market is likely to move lower. So I will be quick with this one, or else the length of the video will be too long. And if you are able to understand everything associated with trading a bull flag, then trading a bear flag is just a walk in the park. You just have to flip everything you learned with the bull flag at 180 degrees and there you have it. You now know bear flag pattern. Now here's how to identify a bear flag. First you have to look for a strong trending move lower. This means the range of the candles is more bearish than usual and they tend to close near the lows. After the strong bearish move lower, the market takes a break in the form of a pullback. Now the pullback should consist of smaller range candles compared to the earlier bearish move, and the more tighter the range, the more likely the market will break out lower. Now the strong bearish move represents the pole of the flag, and the price consolidation during the pullback forms the flag of the pattern. The flag retracement should not move beyond 50% of the pole length, or else it is not considered a bear flag pattern. Now the entry criteria are also similar, except for the fact that we will now be looking for shorting opportunities only, being a bearish continuation pattern. Now you can look to sell when the price breaks below the support trend line, but it is usually prone to fake outs. So the better option is to wait for the breakdown candle to close and then enter below its low. But sometimes if the breakout candle is very large, you will be entering at a very low price and the risk to reward will be affected. So you can either wait for a pullback or retest back to the breakdown trend line and then take a short entry when the prices start to move lower. Now the issue with this entry technique is that during a strong downtrending market, the price won't pull back often enough and you will miss out on most of the opportunities. So it is up to you to decide your entry strategy and continue practicing it over a large number of trades. Also make sure to validate if the breakout is real by using volumes and momentum indicators like MACD, RSI, etc. When it comes to protecting your positions, you can place your stop loss at a level that invalidates your trading setup. So a bear flag pattern becomes invalid if the price breaks above the resistance trend line. With that idea in mind, you have to keep the stop loss above the resistance trend line, or to be even safer, you can give the price some breathing space by keeping 1 ATR buffer above the swing high level, depending upon your risk appetite. Now finally, the target can be based on the price projection method or trailing stop loss method. In case of price projection method, you have to measure the length of the flagpole and then project it from the breakdown point below the support trend line. This will give you your projected future target price. For the trailing stop loss method, you can make use of moving averages like 20 or 50 period moving average depending upon your trading style, or you can use an indicator like Chandler stop to ride your positions in case of a range breakdown or strong downtrend. Now it is a deadly combination if you make use of both these techniques to exit your winners. Now the most important thing to figure out is where to find these flag patterns. You can find a bear flag during a support line breakdown, which is followed by a primary pullback. Now the breakout candles represents the flag, while the primary pullback forms the flag consolidation of the pattern. Now you can take a short entry as per the entry criteria of your choice when the price breaks below the flag consolidation. Now the most common place where you will encounter a bear flag is during a strong downtrend. As we have discussed earlier, we can identify the market trend using moving averages. Now the selection of moving averages will depend upon the trade duration or your trading style. For example, the 20 moving average is good enough to determine the short-term trend. The 50 moving average is suitable to identify the medium-term trend, and the 200 moving average can gauge the long-term market trend. But the most important thing is to make sure that the price stays below the moving average and is sloping downwards. Now, yet another occasion to look for bear flags is in a range market, especially those where there is a build-up happening near a support level. Now, this build-up can sometimes be in the form of a flag consolidation, and you can enter a short position when the price breaks the build-up and the support level. Now, the entry criteria, stop loss and targets will all be the same as in the other cases, but make sure that the breakout is a valid one. You can also find a bear flag at the end of an uptrend when there is a break in the uptrend structure which is accompanied by a flag pattern consolidation. Now this will help you enter a trend reversal even before it happens. Pennants are a class of chart patterns that closely resemble the flag patterns and symmetrical triangle patterns in the way they form and give breakouts. But if you were to consider a pennant and a flag as two brothers, then the pennant is the more aggressive brother due to the explosive breakouts it provides and the reward for risk it generates. Now there are two types of pennants, bullish pennants and bearish pennants. Let us focus on the bull pennants first. Now the bull pennant is a chart pattern that forms a triangle during the pullback. Now it consists of two parts: the impulse move, which forms the leg or the pole of the pattern, and the correction move, which is formed as a result of the pullback. Now you may ask, what is the difference between a bull pennant and a symmetrical triangle? Because they both look similar. Now the answer is quite simple. The difference is in the duration of their formation. With a symmetrical triangle, you can clearly see the swings of the pattern. However, the candles of the bull pennant are too crowded and too volatile for you to see the swings. Regardless, a bull pennant is more similar to a bull flag pattern. Now, as I have cited earlier, bull pennants creates a more explosive breakout than bull flag pattern. Now, let me explain the reason why. I hope you have seen videos in which a Coca-Cola bottle is shaken and then thrown onto the ground. Now, the cap explodes and the bottle flies off. I don't want to go deeper into the physics of this, but one of the factors that triggered this event is actually the shape of the Coke bottle itself. If you try the same experiment with a Coke can, you may not get the same result. Now the bottle is shaped similar to a nozzle, with the width of the bottle becoming narrower towards the top, in comparison to a can where the width is almost equal throughout. So what's the deal? Once you shake and throw the bottle, the gas pressure builds up and the Coke wants to get out, and the easiest exit is through the cap. But as they head towards the cap, the width starts getting narrower. The pressurized gases inside the bottle would go into rage mode and blast open the cap. Please don't blame me for this terrible physics lesson, but the point that I'm trying to prove is that the same thing happens with buyers and sellers in a bull pennant pattern. The shrinking prices from left to right of a pennant pattern is a sign of impending volatility, as both the buyers and sellers are itching to get out of the pullback. Now this can result in a rather explosive breakout. But since the bull pennant pattern is not a trend reversal pattern, instead it is a trend continuation pattern, we will only look for buying opportunities. This means that you are better off trying to use this pattern to ride on the existing trends rather than catching the bottoms. Now let us talk about the entry, stop loss and target criteria for this pattern. Now starting off with the trade entry criteria, one of the most costly mistakes that traders make while trading the pennants is entering a bull pennant too early. As you know, ranging markets or even pullbacks can be challenging to enter for two main reasons. The range can overshoot or the range can undershoot. Now, overshooting happens when the market is highly volatile and the prices will move beyond the trend line more often, forming false breakouts. Now, undershooting is the opposite. that is, the price fails to test the trend line every time. In case of a bull pennant, we should be more cautious about overshooting due to the tight range. So what would happen if you buy as soon as the breakout above the trend line happens, or if you place a buy limit order above the swing high? More often than not, the price could easily touch your buy order and reverse back into the range, forming a fake out or overshoot. Now this can be annoying and can result in losses. So what is the key here? Now the ideal thing to do is to wait for the bullish breakout candle to close above the pennant line. If the price makes this kind of a move, it's clear that the buyers who got squeezed finally managed to break out strongly, similar to the case of an exploding Coke bottle. So you can look to buy above the breakout candle's high price. But sometimes the breakout candle will be too large and you will be buying at a very high price, thereby affecting your reward to risk ratio. The best move in such a situation is not to take the trade at all, or you can wait for a pullback or retest back to the breakout level and then take an entry when the price starts to move higher. But because of the explosive nature of breakouts from the pennants, the chances for a pullback or retest are fairly dim. So the best possible entry could be above the breakout candle high. Now validating the breakouts using volumes and other momentum-based indicators can be a good practice. During the pennant consolidation, the volume has to decrease due to the evident shrink in volatility, and the breakout has to be supported by higher than average volumes, which could indicate a rise in the buying interest. Now that you have learned how the bull pennant works and how to enter it, let's talk about how and where to set the stop losses when trading the bull pennant pattern. As I have already discussed, you don't want to set your stop loss at obvious levels like support and resistance, swing highs or lows, etc. because you can get stop loss 100 easily. So your stop loss should be at a level that if crossed invalidates your trading setup. Now we are trading a bull pennant here and the pattern is deemed invalid when the price breaks and closes below the bottom trendline support. So you have to keep your stop loss level below this trendline support or below the swing low level to be precise. Now there are still chances of long wicks due to the overshooting issues which can take out your stop loss if you keep it very tight, and then the price can move higher in the desired direction, which can be really frustrating. So to be extra safe, you can give your trades more breathing space or buffer by setting the stop loss some distance away from the pennant market structure using the ATR indicator. Now once you identify the swing low of the bullish pennant pattern, you can set the stop loss 1 ATR below the swing low level. And finally, let's learn how to set a target for the bull pennant patterns. Now there are many ways that you can exit your winners, and one of the standard approaches is to have a predetermined profit target based on the length of the leg or the pole of the pattern. This is called the price projection method, and here you have to first measure the length of the pennant leg, then project this length from the breakout point above the resistance trend line. Now this will be your profit target. You can also choose to trail your stop loss until the market takes you out of the trade. Now is this a better option? Think about this. The bull pennant pattern usually appears in a strong trending market or just after the price breaks out of a range. So in such market conditions, there is a lot of potential for the trend to continue higher, and the only way to ride it is to trail your stop losses. Now to trail your stop loss in the best possible manner, you can use the indicators like moving averages or Chandler's stop and only exit the trade if the market closes below it. Moreover, it is a much better option if you use a combination of both the price projection method and the trailing stop loss method, so that you can gauge the potential of the move beforehand using the projection method so as to lock in part of your profits there and then ride the rest of the position using the trailing stop loss method, thereby not impacting your psychology and avoiding any big losses due to price reversals. Now that you have learned what a pennant is and how to trade one, it is essential to make a note of where to find one. So what are the different types of market condition where you can find a bull pennant pattern? Now bull pennants can be found almost anywhere, be it in uptrend, range or downtrend. The only thing to remember is that whenever it forms in the market, the bull pennant is a bullish continuation pattern, and our bias should always be looking for long trades only. With that in mind, let's talk about each case separately. First, you need to define what an uptrend is in terms of your trading style and time frame you trade. Because if you can't define a trend objectively based on your requirements, then it is difficult to spot a bull pennant setup that satisfies your trading style. Now, the easiest way to define a trend is by using a trend filter, such as a moving average. Now, you can use any moving average like 20 period, 50 period, or 200 period, etc. to identify the trend based on a short-term, medium-term, or long-term perspective. Let's say I have a medium-term outlook, or I am a swing trader and I make use of the 50 period simple moving average to define the trend. Now, if the price is above the 50 period moving average, it means the trend is bullish for me. Then I will look for bull pennant opportunities. And if a bull pennant pattern is spotted, then you can look to take a long entry above the breakout candle. And since we don't know how long the trend lasts, you can even use the 50 moving average as your trailing stop loss, and we would exit only when the price closes below the 50 moving average. So here, not only do we use the 50 moving average to filter trends, but we can also use it to book our profits. Since the bull pennant is a trend continuation pattern, you might have the idea that this type of setup is unfavorable. So how exactly are we planning to trade the range market? Literally speaking, we are not trading the range market. Now, what am I suggesting? Now, it means that instead of trying to buy the highs and lows within the range, we wait for the range to potentially end. That is, we look for tight consolidations or build-ups in the form of a bull pennant pattern which is forming near the resistance level. So the moment you see a bull pennant forming at the resistance, it tells you that the buyers are starting to dominate and an explosive breakout is imminent. You can look to enter above the breakout candle or when the price closes above the resistance, and maybe you will even get a retest if you are lucky enough. Now, the stop loss and the targets are same as we have discussed earlier, and since there is no valid trend, you can use a tighter moving average such as a 20 period moving average if you wish to trail your stop loss. Even though the bull pennant is a trend continuation pattern, there is still a way you can profit by using the bull pennant as a trend continuation pattern even on a downtrend. Now, this method has to do with the market structure. Here you have to look for a few things before you proceed. First of all, the price must close above the downward trendline resistance. Now, we are talking about a break in the downtrend structure. Then, if the price forms a bull pennant above this trendline resistance, you have a jackpot trade. What you're doing here is trading between an ending downtrend and a potential starting uptrend. So you can benefit tremendously if you are able to catch the uptrend from the start. Now, the entry, stop loss and target conditions will be the same, and similar to the range market strategy, I still suggest you use a tight trailing stop loss such as a 20 period moving average, since we are taking sort of a contrarian position. I won't go into all the details of a bear pennant. This is exactly the opposite to bull pennants. Now, it is a bearish continuation chart pattern. It has a leg comprising of impulse candles with a strong bearish body, followed by a tight consolidation associated with smaller candles and a contraction in volatility. We expect the price to break out explosively below the trendline support level and continue with the trend. Even though this pattern is usually found in a downtrending market, we can also spot it when the price is about to break down from a range below a support level where a build-up is set up in the form of a bear pennant pattern. You can even find it at the end of an uptrend where the break of the structure is accompanied by a bear pennant pattern. Now, if I were to discuss the entry criteria, we will only look for shorting opportunities. Since the breakdown is expected to be explosive in nature, we can look to enter when the breakout candle gives a close below the trendline support. You can then short below the low of the breakout candle. In case if the breakout candle is too large and is affecting your reward to risk, it is better to drop the trade or wait for a pullback to the breakout level, which happens less often in the case of a pennant. So it is up to you to decide where you want to enter. Now make sure to validate the breakdown every time using volumes or momentum indicators or both. Now the volume generally declines during the pennant formation and it increases above average when the breakout happens. Now the stop loss can be kept above the swing high level of the pennant, and providing 180R buffer above the swing high can deal with the unexpected overshoots and stop loss hunting. Now the target can be kept by using the price projection method, where the length of the leg is set as the target by projecting it below the breakdown point, or you can adopt the trailing stop loss method by making use of suitable moving averages when you are planning to ride the trend, and you only exit when the price closes above the moving average. Now moving on, we will focus on the triangle patterns, namely the ascending triangle and the descending triangle chart patterns. So let's start with the ascending triangle patterns. The ascending triangle is a bullish chart pattern that signals the market is about to head higher. Now, as you can notice, the ascending triangle has a series of higher lows that approach a resistance line. Now, this is a sign of bullish strength, and for a few possible reasons. Now, the higher lows are an indication that the buyers are willing to buy at higher prices. Now, think about it. If the buyers were not willing to buy at higher prices, you won't see higher lows coming into the resistance. Now, the fact that the market forms a series of higher lows tells you that there is demand even as the price continues higher. The second point is that there is a lack of selling pressure. So if there was actually a strong selling pressure, the price would not remain at the resistance for a long period. Instead, it would rather move lower very quickly. But since the price is hovering near the resistance, it means there is a lack of selling pressure even though it's an alluring level to sell. Yet another point to keep in mind is that there are a lot of buy stop loss orders that are clustered above the resistance, because as the price retests the resistance every time, more traders will look to short the market and they will place their stop loss above the resistance level. In such a situation, think about what will happen if the market breaks out higher. Well, all these buy stop loss orders will be triggered, and this will fuel further price advances towards the upside. So don't make this common mistake when trading ascending triangle pattern, because most trading books will tell you to go short when the price is at the resistance level. But not every resistance is meant for shorting. Instead, you must watch how the price approaches it. Since you have learned that higher lows coming into the resistance is a sign of bullish strength, this means the market is likely to break out higher from the resistance. And the last thing you want to do is to go short and trade against it. I hope things are making sense. Now we will talk about the entry criteria. So how to better time your entry? Well, there are a few ways to do it. The first approach is to go long when the price breaks above the highs of the ascending triangle or above the resistance level. Now, all you need to do is to place a limit buy order above the resistance level, and you will be immediately long when the price breaks above the highs. If the breakout is real, this is one of the best prices to enter. But this method is very risky, and chances are it might be a false breakout. The next method is similar to the previous approach. The only difference is that you wait for the price to break and close above the highs of the ascending triangle pattern. You can enter long above the breakout candle highs once the candle closes. This method reduces the likelihood of a false breakout, but if the breakout momentum is quite strong, you will be entering at a very higher price. So if you are an experienced trader, then you can even enter the market as the price pulls back or retests to the resistance line of the triangle pattern. Now this can help you enter the trade even if you miss out of the breakout move, and it offers a better entry price than waiting for the close of the breakout candle. But the issue with this approach is that the market may not give a pullback or retest every time. So it is up to you to choose the entry type that you like based on whether you are a conservative or aggressive trader with your approach. Now make sure to validate the breakout with volumes and other momentum indicators to see if there is actually an interest in the market participants to take the prices higher. Now we will learn how to set a proper stop loss so that you don't get stopped out too early. Now it doesn't matter whether you are trading the ascending triangle, breakouts, pullbacks, etc. because the concept is the same. Your stop loss must be at a location that, if reached, will invalidate your trading setup. Now this means if the market hits the stop loss, you will automatically know you are wrong. So a stop loss below the resistance level is not a very good idea. So where else will you place it? Think about it. What is the ideal place to set a stop loss so that if the market reaches it, you know the ascending triangle pattern is invalidated. Since the pattern forms higher swing lows, and if the price moves below the recent swing low and forms a lower low, then we can be sure that our analysis has gone wrong. So it is exactly the place where you need to keep your stop loss, that is just below the recent swing low level. You can give the price some breathing space by adding one ATR buffer below the recent swing low. I hope it is clear. Now the third and most important point, when and where to exit your winning trades for maximum profits. Now as always, there are two techniques you can consider: the trailing stop loss method and the price projection method. The idea of a trailing stop loss is that we have no idea how long a particular trend will last. So we trail our stop loss to ride the trend as far as possible to lock in your gains as the market moves in our favor. So how do you trail your stop loss? Well, as I have mentioned a number of times, you can use an indicator like moving average. For example, you can trail your stop loss using 50 period moving average for a swing trading strategy. This means you will hold your position until the market breaks and closes below the 50 moving average. Now some of you might be wondering why 50 moving average always. Actually, there is nothing special about 50 moving average. A much better question to ask is what type of trends do you want to capture and what is your trading style? Now for a long-term trade you can use the 200 period average. For short-term trends you can use the 20 period moving average and so on. The second method, the price projection method, is a classical charting technique to project where the price will exhaust itself. So here's how it works for an ascending triangle pattern. You have to calculate the width of the ascending triangle from the highest point, which is the resistance level, to the lowest point. Now add this amount to the breakout level, and that's your price projection or expected target level. Now, one of the issues with price projection is that the market can almost hit your target profit only to make a sudden reversal, and sometimes it can reverse all the way back and hit your stop loss. So what would you do to avoid something like that happening? The best idea is to combine both the techniques, that is, make a trailing stop loss and price projection combo. This means if the market moves in your favor but it hasn't reached your price projection level, you can utilize the moving average to lock into your profits. So even if there is a sudden reversal, you still protect what you have and do not give everything back to the market. Now the descending triangle is yet another logical pattern, and if traded correctly, it allows you to catch explosive breakout trades about to occur. This is a bearish chart pattern that shows the sellers are in control and it signals a bearish trend continuation. Now the descending triangle looks like a series of lower highs coming into an area of support. The pattern signals strong selling pressure and a lack of buying pressure. Usually when the price drops lower, more demand comes in to push the price higher. But that is not the case for descending triangle, because as the price drops lower, there is still a lack of buying pressure. Instead, the sellers are willing to sell at even lower prices. That's why you get a series of lower highs. Now yet another point to consider is that sell stop loss orders are clustered below the support level. This is because many traders will buy because the price is at the support and they will set their stop losses below the support level, since that's what most textbooks teach them. Now as more traders do it, the cluster of stop losses below the support level builds up over time, and since the market moves from one area of liquidity to the other, the price is likely to break below the support and trigger all these clusters of stop losses, which will increase the selling pressure and pushes the price downwards. Now being a bearish continuation pattern, the most common way to trade a descending triangle is to go short when the price breaks below the support level. Still, there are important things to consider if you want to find the highest probability breakout trades. The breakdown should occur near the apex of the descending triangle. Apex refers to the tip of the triangle pattern where both the trend lines meet. Now the reason you want to short near the apex is that it is where the volatility is the lowest and the prices are squeezed. Now when the volatility decreases, chances are the price will explode out of the descending triangle and quickly move in your favor. On top of that, the more times the support level is tested, the better. This is simply because when the price tests the support level multiple times, it will attract more buyers and thereby increase the number of stop loss orders below the support level. Now this is great for a breakout trader because if the price breaks below the support, all these clusters of sell stop loss orders would be triggered, thereby increasing the selling pressure towards the downside. Now moving on, we will focus on how to trade this pattern. So how to time your entry and set your stop loss. I don't know if you have observed, whenever the price falls, it moves quicker than when it rises. So if you wait for the breakout candle to close below the support level, chances are the price might drop a lot and you end up chasing the market. Thus, in this case, it is preferred to use a limit sell order and enter the trade when the price just breaks below the support level. Now, if you are a more conservative trader and you do not want to blindly place a sell limit order at the breakout point because the price could give a false breakout and rise higher. So it is ideal to wait for the price to confirm your bias before shorting the markets after the breakout candle closes below the support level. But there can be occurrences when you can miss the breakout altogether. What happens then? So if such a thing happens, the last thing you want to do is chase the market after a breakdown of the pattern. Instead, a better option is to wait for the price to retest the breakdown point. Now, if you wait for the retest, you are entering a favorable trade location where previous support is likely to act as a resistance level. This means you have a tighter stop loss on your trade, which offers a better reward to risk ratio. But sadly, pullbacks or retest don't happen very often with this pattern. Also, making use of volumes for the breakout validation is a good practice. Now, what about the stop losses? Straight away ask yourself, the point where the descending triangle pattern gets invalidated is when the price moves and closes above the most recent swing high level. So a good stop loss would be above the most recent swing high level, and if you would like to be even safer, give it some buffer like 1 ATR and set it above the recent swing high. Now finally, how to exit your winners for maximum profits. Now similar to every other pattern, there are two ways to exit the winning trades: price projection method and trailing stop loss method. In the price projection method, calculate the distance between the highest and lowest point of the descending triangle. Now take this distance and project it downwards from the breakdown point. This projected future price point is where you exit your trade after you enter a breakdown of the descending triangle pattern. You can also use the price projection technique to decide whether it's too late to enter a trade or not. That is, if the price is close to reaching its projection, there's probably not much reward left in the move and you might want to skip the trade. Now the second method is using trailing stop losses, and unlike the price projection technique, a trailing stop loss does not have a fixed profit target. Instead, you trail your stop loss as the price moves in your favor, so you can ride the entire trend. Now you have to decide on the type of trend you want to capture, whether it's a short-term, medium-term or long-term trend, and you trade your stop loss with the appropriate moving averages. For example, a 20 moving average can be used for a short term, 50 period moving average for a medium term, and 200 period moving average for long-term trends. Then exit your trades when the price closes beyond or above the moving average. So if you want to capture a price swing in the market, the price projection technique makes sense. And if you want to ride trends in the market, then trailing stop loss works best. Now moving to our fourth category of patterns, the rectangle patterns. The rectangle formation is a classical chart pattern established by horizontal lines, which represents the important support and resistance. Now this is a continuation pattern that forms a trading range during a pause in the current market trend. It is quite easy to identify the pattern because it has at least two comparable highs and two comparable lows. These highs and lows can be joined to make two parallel lines that form the top and the bottom of the rectangle. Now, a rectangle formation shows a period of indecision between sellers and buyers as they take turn throwing punches at each other, but neither of them have the dominance over one another. So the rectangle patterns are also known as trading ranges or congestion areas or consolidation zones. In this case, we are talking about continuation patterns, so we expect the price to break out and continue with the original trend. So in that sense, there are two types of rectangles. The top rectangle, which is formed during an upward price move, it signals the continuation of the uptrend. The next rectangle is formed during a downtrend and is called as a bottom rectangle, which signals that the down move will continue after the breakout. Now the rectangle patterns can also reverse the trend. So these reversal patterns are given specific names like double top and triple top when the price tests the resistance twice and thrice respectively and then moves lower. The other category is double bottom and triple bottom, where the price tests the support level twice and thrice respectively and reverses upwards. So in order to clearly understand what the pattern is about to do, we have to wait till the breakout happens. So it is essentially a confusing piece of price action if you try to learn this pattern by heart. Now what I recommend is to wait for the price to give a real breakout and then decide if you want to trade with the trend or against it. So in short, in order to identify the rectangle pattern, we will need to locate a trending stock that is having a period of consolidation. And there should be minimum 2 tops and 2 bottoms that are horizontal to one another, which will act as the resistance and support levels. As I have mentioned, the top rectangle is seen during an uptrend. You would need to notice a breakout through the upper level of the pattern. Now this will confirm that the bullish move is coming back, and traders can look to enter long positions when the pattern forms a break above the resistance level to continue with the bullish trend. While the bottom rectangle pattern is the total opposite of its bullish counterpart, this pattern occurs during a downtrend and the price would need to break the lower support level of the pattern to confirm its presence, and traders can look to enter short positions when the price breaks the bottom of the range to continue with the bearish trend. Now how to trade when you see a rectangle pattern? For a top rectangle pattern, you can enter a long trade when the price breaks above the resistance level if you are an aggressive trader looking for the best price to take an entry. The downside is that it could be a false breakout and you can get stopped out. The next approach is more conservative, where we will wait for the breakout candle to close above the resistance level. Most often, this method will reduce the chances of getting trapped in a fake out. But the only limitation is when the price breaks out with huge momentum and you will now be buying at higher prices. And finally, what if you miss out of the breakout completely? Then the only option available is to wait for a pullback or retest back to the resistance turn support level and take an entry from there. And if the retest doesn't happen, don't chase the price. Just avoid trading it altogether. You'll find even better trades. Make sure that the volume rises during the breakout, indicating a higher buying interest. You can also use indicators like MACD, RSI, etc. to do the same. And for a bottom rectangle pattern with a bearish breakdown, our primary instinct should be to sell. Now here are the 3 entries possible. The most aggressive is entering as and when the breakout happens. The more conservative approach is to wait for the confirmation after the close of the breakdown candle below the support level. The final option is to wait for a retest in case you missed the breakdown. So I leave it up to you to decide. Make sure you validate the breakout with volumes and momentum based indicator each and every time. Now we will learn to set a proper stop loss. We don't want the stop loss to affect our risk management. So when you notice a rectangle breakout, you have to measure the distance between the support and resistance and then place your stop loss in the middle of this length. This is applicable to both top and bottom rectangles. Now your trade will be secured by doing this, and you will be aware that the maximum you can lose from this trade is equal to half the size of the pattern. Now after buying or selling on the rectangle breakout pattern, the stop loss should be placed at the midpoint because the breakout will likely to have shakeouts before continuing with the trend. Thus, if you put your stop loss at or just below the breakout point, the smart money will probably hit your stop loss before beginning to run with the trend. Now how to exit a profitable trade? When trading the rectangle pattern, there is a clearly stated rule about the minimum target. You should remain in your trade for a minimum price move which is equal to the size or the width of the pattern. This implies that the distance between the support and resistance of the triangle should be placed on the chart beginning from the breakout moment. Now, since the stop loss is at the midpoint of the rectangle range, it means that the target is twice the size of the stop loss. This enables a reward to risk of 2:1 from the offset. You can also use the trailing stop loss method if you want to ride the trend until it's exhausted. There is yet another way in which traders can successfully trade rectangles, and that is by buying at the support and selling at the resistance levels if the width of the rectangle pattern is very high. Now this can be used as an intraday or swing trading strategy if it provides a sufficient reward to risk ratio. So for a top rectangle pattern, you can take a long entry from the bottom support level and place your stop loss below the lowest wick or candle formed during the consolidation, and the target will obviously be the next resistance level. Similarly, for a bottom rectangle pattern, you can look to short when the price reverses down from the top resistance level and place your stop loss above the highest wick or candle that is formed during the consolidation. The target is obviously the lower support level. Now let's jump into the final category of patterns. First of all, I will talk about the cup and handle pattern. The reason why I have kept the cup and handle pattern for the last is that there is still an ongoing debate as to whether the cup and handle pattern is more of a continuation pattern or a reversal pattern. In my opinion, the cup and handle pattern can be both a continuation and a reversal pattern. Now it depends on where it is formed in the chart. If it is formed during an uptrend, then this pattern indicates a bullish continuation. Likewise, if it gets formed during a downtrend, the pattern will indicate a bullish reversal. Now, I am not actually curious about where the pattern forms, but I am more interested in the fact that the breakout always occurs towards the upside. That is, the cup and handle pattern is expected to give a bullish breakout. Now let's dive into the finer details. The pattern comprises of two parts. As the name suggests, a cup and a handle, and also a neckline which will act as the resistance. The cup forms after a bearish price decline, which is followed by a period of consolidation with smaller or weaker candles that shows signs of the market bottoming, after which the price makes a higher high towards the resistance, which indicates that the bulls are taking over from the bears gradually. Now it looks like a ball or an object with a round bottom, and the volume should decrease towards the middle of the pattern, which is during the consolidation, and then rise towards the up move, which indicates an increase in the buying pressure. How the price reacts at the resistance is important because it tells you whether there is still selling pressure available at the resistance. Now, a cup and handle pattern becomes invalid if you see a large sell-off from the resistance level, as it tells you that the selling pressure is still available there and the market is not ready to head higher. But if you notice that the price is holding up nicely at the resistance, then it is a sign of strength, as it tells you that the buyers are willing to buy at higher prices. So the handle has to form a tight consolidation or build up under the resistance level. At this point, many traders would do what they have learned from many trading books. That is, the price is at the resistance and it is time to go short. Now that's fine if the price has made a strong momentum move into the resistance and it got rejected strongly from there. But if the price approaches the resistance and forms a build up, or even if it makes higher lows into the resistance, then you have to be very careful, because this is a sign of strength which is telling you that the buyers are willing to buy at these higher prices. And the last thing you want to do is to short the market, because it's likely to break out higher. So the handle has to give a tight consolidation, which can be in the form of either a bull flag pattern or a bull pennant pattern, which by themselves are bullish continuation patterns. Now moreover, the volumes should decline during the consolidation, indicating a lack of selling pressure. Also keep in mind that the handle has to be smaller than the cup, and it should not drop into the lower half of the cup, and ideally it should stay in the upper third of the cup. The deeper the handle moves down, the less likely the market will break out higher. Now the handle is the last bearish attempt to push the prices lower, and when it fails and the prices breaks above the handle, we can expect the market to rise. Now let us take a look at the entry, stop loss and target criteria. The first cup and handle confirmation comes when the price breaks above the tight consolidation range. So this is the most aggressive and cheapest entry price that you can find. But since there is a resistance level above it, the price could just reverse and hit your stop loss. So an alternative entry is to go long on the breakout above the neckline. This is the second best price you can get an entry at. But there is still a danger of a false breakout in this method. And if you are more conservative, you can wait for the breakout candle to close above the neckline and then take a long entry on the next candle above the breakout candle highs. However, sometimes the market closes much higher and you will have a poor reward to risk ratio. Now this will result in a wide stop loss and a smaller position sizing on your trade. And in such instances, you can wait for the price to do a shakeout in the form of a pullback or retest back to the neckline. And you can plan to enter when the price reverses higher. Now make sure to validate if the breakout is real by using volumes and other momentum indicators. Another point to note is that the cups that have longer and more U-shaped bottoms gives a better signal, and it is better to avoid the cups with a sharp V-shaped bottom. Now the second question is, where should I set my stop losses? Now whenever you place a stop loss, it should always follow this thumb rule. Your stop loss should be placed at a level where if the market reaches it, your trading setup is invalidated. Now ask yourself, when will a cup and handle pattern becomes invalid? A cup and handle pattern invalidation comes when the price breaks below the handle of the pattern. Now the stop loss setting is same as in the case of a bull flag or a bull pennant pattern. Now you don't want to put the stop loss at the exact low of the handle because the market could trade into that area of value and then reverse higher. So instead give it some buffer below the handle, like 180 or below it. And finally, how to exit your winners. The first method is obviously the classic price projection method. Here we measure the height of the cup from the bottom of the cup to the neckline and then project it from the breakout point above the neckline. This will be your future profit target. Now the second method is to use moving averages to trail your stop loss and ride big trends. So in a trending market, the price can remain above the moving average for a long period of time, and you will only exit when the price closes below the moving average. Moving on to the final pattern of this video, the inverted cup and handle pattern. If you flip a cup and handle pattern upside down, you will get an inverted cup and handle pattern. This is a pattern that gives a bearish breakdown. Depending on where it is formed in a trend, it can be a bearish continuation pattern or a bearish reversal pattern. But we are least interested in where it forms. But we are more interested in the bearish breakdown that it provides. The formation of the inverted cup shows a depleting demand and a lack of buying pressure, which can be validated by using the volumes. Now the handle should be a tight consolidation in form of a bear flag or a bear pennant, which also comes with contracting volumes. Now if the handle moves way higher beyond the 50% of the cup, then it is better not to consider it as a valid pattern, since there is enough buying pressure still available at the neckline or the support level, which is pushing the prices higher. The entry criteria are to either take a short trade when the price breaks below the handle of the consolidation or when the price breaks below the neckline. And a more conservative entry would be below the low of the breakdown candle after the breakdown candle closes below the support level. And if you have missed out on an entry, you can wait for a price pullback or retest back to the neckline and then go short when the price reverses lower. Now the stop loss can be placed with 180 buffer above the handle of the pattern. And finally, the target can be set equal to the height of the inverted cup from the neckline to the top of the cup and projected below the neckline from the breakout point. Yet another way is to ride the whole trend using a trailing stop loss method using moving averages and exit only when the price moves above the average. Now that is all the major continuation patterns in a single video.
Now in the last part, we talked about 5 different types of continuation chart patterns. However, in this video, we will talk about reversal chart patterns, and we will not just talk about it, we will examine why these patterns work in the market and why you should trade them. We will discuss the 4 most common and most profitable reversal patterns along with their entry, stop loss and target criteria. And if you don't know what reversal patterns are, as the name suggests, these patterns signal that the existing trend in the market will most probably reverse, or in simple terms, they predict that the market will take a U-turn in the opposite direction of the existing trend after the end of the pattern. Now most of these reversal patterns are formed as consolidation in between the trends. So it's like the market telling us that it is tired of going in a particular direction and is looking to move in the completely opposite direction after taking some rest. So in this video, I'll be discussing 4 reversal chart patterns and their counter patterns, starting with the head and shoulders and inverted head and shoulder patterns, followed by double top and double bottoms, then triple top and triple bottoms, and finally we will wind up with the rising and falling wedges. So without wasting any time, let's begin. The head and shoulders pattern is one of the most popular reversal chart patterns out there, and because it is popular, the chances of making a mistake is also high. Now let us understand what this pattern really implies. Actually, the pattern consists of 4 different parts: the left shoulder, the head, the right shoulder and the neckline. Overall, the pattern looks simple, right? But what does it actually mean and why does it matter? Let's analyze this in greater detail.
We will start from the left shoulder. The initial trend in the market is an uptrend where the prices rallies higher, and then the market does a pullback or a correction, and the left shoulder is formed as the market does a pullback. And at this point, there is no way to tell if the market will reverse, because a pullback occurs regularly in a trending market, and it may just be another swing low from which the prices can move higher. The market then trades above the previous swing high, forming a higher high. However, the sellers take control or resist the upward rally and push the price lower towards the previously formed swing low. Now, the swing high formed as a result of this price action is the head of the pattern. Also, the line connecting both the swing lows forms a support level called as the neckline. Now, what we can observe here is that the uptrend structure of higher highs and higher lows is violated. But still, we cannot guarantee that a reversal will happen because the price might even trade sideways. Now, once again from the neckline, the buyers make a final attempt to push the prices higher, but they fail to even break above the previous high or the head of the pattern. And yet again, the sellers take control and push the price towards the neckline. This forms a lower high in compared to the previous high, which indicates a shift in the sentiment towards bearishness. Now, the only level that stands in favor of the bulls is the neckline, which is also a support level. Or in other words, the neckline is the last line of defense for the buyers. And if the price breaks below it, the market could head lower and begin the start of a new downtrend. So basically, the head and shoulder pattern signals a possible trend reversal as the buyers fail to push the prices higher. Are all head and shoulder patterns worth trading? Actually, there are a few things that you must seriously look at before you trade the head and shoulder chart pattern. These things are associated with how reliable is the head and shoulder pattern formed. Now, what you need to understand is that not all head and shoulder patterns are created equal, because how the right shoulder forms is a key criterion to whether you want to trade the breakout or not. For example, if you have a head and shoulder pattern that has a very long right shoulder, then you want to avoid buying the breakout. And why is it so? Because the price has moved a very long distance from the highs of the right shoulder to the neckline of the support area, which will attract more sellers on the way. So the market is likely to face a buying pressure due to the profit booking by the sellers and also from the traders who want to buy from the support level. Now, this creates a strong buying pressure, which will lead to an increase in the price, and the pattern will fail. So make sure that the right shoulder is shallow, and ideally it should stay below 50% of the head. Other than this, there are two more things you must pay attention to while selecting the best head and shoulder patterns. First one is the market structure, and the second one is the duration of the pattern. Let me explain each one of them. It is true that head and shoulders is a reversal chart pattern, but if the market is in a very strong uptrend, it is very unlikely that a simple chart pattern can reverse the entire up move. Instead, the market is likely to continue higher. Maybe the pattern can generate a short-term retracement, but not entirely a reversal. So make sure that you don't bet against a very strong trending market just because you have seen a head and shoulder pattern. Now, the second factor is the duration of the pattern. A typical head and shoulder pattern can take 200 days, 20 days, or even 20 minutes to form, depending on the chart time frames that you follow. But with some common sense, it is very obvious that the pattern that takes 200 days to form is more significant than a head and shoulders that takes 20 days to form, which is more relevant than a pattern formed in 20 minutes. And why, you may ask? Because if the market breaks the 200-day pattern neckline, there will be more traders or buyers who bought at the support, and most of them will keep their sell stop loss orders just below the neckline. Now, these buyers will get trapped and they will rush for exit, or their sell stop loss orders will be triggered on breakdown, which will further increase the selling pressure. Now, when you take the case of the pattern formed in 20 minutes, this may not always hold true because only very few people are aware of it, and the pattern may not give you the desired result. So a head and shoulder pattern on a higher time frame and one that took more time to form has a higher chance of success. Now, this does not mean you go short immediately when the price breaks the neckline. There are a few ways to trade the head and shoulder chart pattern in the best possible manner. Now, I will start off with the trade entry techniques, and there are 4 possible entry methods for this pattern. The first and most aggressive entry is when the price breaks down the neckline. Now the idea is to wait for the breakdown candle to close below the neckline and then take a short entry below the close or the low price of the breakout candle. Now the advantage of this technique is that you will be able to enter into a trade very early and perhaps you will get the best possible entry price, but the drawback is that the price could reverse and give a false breakout and might even hit your stop loss. So the second entry technique is associated with a breakout following a build-up of prices. Now build-up means a tight consolidation of prices near an area of value, prominently near a support or resistance level. You can learn more about this concept in the secrets of support and resistance in my price action course. In this case, we will wait for the market to form a tight consolidation near the neckline or support level. And if the market breaks down, you can reference your trade entry just below the close or the low of the breakdown candle. Now the advantage of this method is obviously the tight placement of stop loss and an improved reward to risk ratio, which we will discuss in the next section, and it also provides a good entry price. But the drawback is that the breakdown candle can be huge and you will be selling at a much lower price. Now you might be wondering, what if I miss the breakout, or what if the market doesn't form a build-up and still continues to head lower? Won't I miss out on the trade? Now this is a relevant question because build-ups don't actually happen every now and then. So another common method is waiting for a primary pullback in prices. This technique lets you catch the price move even after a breakdown. Now here is how it works. So if the market breaks down without forming a build-up, then we will wait for a primary pullback to occur, which is a temporary up move of prices with weak candles, which generally resembles a flag or pennant pattern, which you may obviously know how to trade. And eventually if the market does a pullback, then you can look to go short on the break of the previous swing lows or enter right away when the price starts moving lower. And as I have mentioned, the best pullbacks are those with shallow retracement and small bodied candles. But what if we get a steep pullback and with large bodied candles? What will we do then? Now, if the pullback is deep, then we will wait for the price to retest the neckline or the previous support turn resistance level as per the principle of polarity. We have to observe if the price retests the neckline and then wait for a price rejection from the neckline in form of bearish reversal candlesticks like shooting star, bearish engulfing pattern, evening star, etc. You can learn more about reversal trading using candlesticks in my price action course. And if you find there is a price rejection, then you can go short on the very next candle. Now the retest technique lets you time your entry and even short the market at better prices. But the downside is that the market will not always do a retest and you might miss out on the trade altogether. Another important point to keep in mind is that the volume should decrease during the formation of the left shoulder and the head, indicating a loss in the buying interest, and it should rise during the formation of the right shoulder and also during the breakout, confirming an interest in selling. So make sure you use the right entry techniques at the right times. Now let us talk about the placement of stop losses with respect to our entry criterions. As I have discussed multiple times, the stop loss should be at a level that if breached will invalidate your trading setup. Now since we are dealing with a head and shoulder pattern, your stop loss should be at a level that invalidates the pattern altogether. To be fair, if the price moves above the right shoulder, the pattern will get invalidated. So if your entry was aggressive as and when the price breaks down from the neckline, then you should set your stop loss at or above the right shoulder of the pattern. Now what if you took a short entry after a build up near the neckline? Then you get the freedom to place a much tighter stop loss, preferably just above the build up consolidation, which will boost your reward to risk ratio by some margin. Now let's say you missed both these entries and you shorted the market after the prices formed a primary pullback. Then set your stop losses above the highest price in the group of the pullback candles, or just place it above the neckline if the pullback is formed very close to the neckline. And the last method is if you have entered after a retest. In this scenario, the stop loss can be placed just above the highest wick of the group of retest candles, or you can be more conservative and place the stop loss above the right shoulder of the pattern. And finally, we will take a look at how to exit from our trade for maximum profit. Well, there are three popular techniques that you can use: the price projection method, the trailing stop loss method, and a combination of these methods. Now let me explain each one of them. The price projection is a classical charting technique that determines where the move might end. Now it focuses on price exhaustion. The idea is quite simple. The prices will move a distance equal to the highest width of the pattern. Now in this case, the highest width of the pattern is from the neckline to the head. So all you have to do is to measure the width from the head to the neckline and then project this distance from the neckline towards the downside. The second method is more like trailing your stop loss to ride big trends. Now if you have followed me on my last video, you know how to trail your stop loss to ride massive trends in the market. One way you can do this is to trail your stop loss with moving averages. The selection of moving averages will depend on the time frame that you're trading on. For short-term trends, a 20 moving average will do the job. But for a medium-term trend, a 50 moving average will be a good choice. And for a long-term trend, a 100 or 200 moving average is the best possible option. The idea is to ride the trend until the price moves above the trailing stop loss where you can exit your position. The last method uses a combination of both these techniques. The idea is to exit half your positions at the price projection level and then ride the rest using a trailing stop loss. By doing this, you will be able to lock into some good profits and not fall prey to the market reversals. Now, I would like to add a few more points as to when and where to trade this pattern on the charts. So when you think about it, head and shoulders is a reversal pattern, but it is also a bearish breakout pattern. With that idea in mind, you can either trade this when the uptrend is weakening and you find a head and shoulder pattern that confirms the trend change, or you can also trade this pattern when the market is in a downtrend and the pattern appears as a temporary pause in the downward price action. Now, by doing so, you are taking a trade in the direction of the trend and not against the forward prices. But make sure that you don't bet against a very strong uptrend just because you spotted this pattern, and it may not work in your favor then. Moving on, the inverse head and shoulders or inverted head and shoulders or reverse head and shoulders pattern is a bullish reversal chart pattern that signals that the buyers are in control. It is just like a mirror reflection of the head and shoulders pattern. So I won't be digging deep into the minute details of this pattern. Anyway, let's find out what inverse head and shoulder pattern really means. This pattern also has 4 parts. The left shoulder is the result of a pullback against the downtrend, either because of a profit booking or eager buyers stepping into the market. But the sellers are still in control as they push the prices lower. However, the buyers are also stepping in, which explains the stronger pullback to retest the previous swing high level, which forms the head of the pattern. From this, we can assume that the sellers are getting weak as they couldn't push the price lower. Instead, the buyers are getting stronger as they continue to push the prices higher, retesting the resistance area or the previous swing high, which forms the neckline of the pattern. Now, the sellers tried to push the price down one last time, but they were met with the intense buying pressure, thereby forming a higher swing low compared to the head of the pattern. Now, this forms the right shoulder of the pattern, and it tells us that the sentiment has changed from bearish to bullish. And if the price manages to break above the resistance, then the inverse head and shoulder pattern is confirmed and the market could continue higher. Now, you might be thinking of buying when the price breaks out of the inverse head and shoulders and gain some profits. But this is not easy because not all of them are reliable. What matters is the strength of the market structure and the duration of the inverse head and shoulder formation. So if the market trend is strongly bearish, the chances of reversal are quite dim even if the pattern forms, and it could just be a short pause before the continuation of the trend. Now the other point is that the longer the inverted head and shoulder pattern takes to form, the more significant it is. This also means that the shorter the duration of the inverse head and shoulder pattern, the more likely it will fail, especially when you're trading it against the trend. Also keep in mind that how the right shoulder forms is also a key criterion for whether you want to trade the breakout or not. So let's say you have an inverse head and shoulder pattern that has a very long right shoulder, then you might want to avoid buying the breakout because the price has already moved a long distance from the lows of the right shoulder to the resistance area, which attracts more buyers along the way. So the market is likely to face a selling pressure from the profit booking by the buyers and also from traders who want to sell at the resistance level. Now this will create a strong selling pressure which will lead to a price decline. So a rule that you can follow is that the right shoulder should be above 50% of the head of the pattern. Now let's talk about when you trade the inverse head and shoulder pattern. Even though this is a reversal pattern, the idea that inverse head and shoulder pattern is a bullish breakout pattern is more prominent. So it makes sense to trade this pattern when the market is in an uptrend. And when you trade the inverse head and shoulder pattern in an uptrend, you just increase your odds of winning because you are now trading with the trend and not against it. Another opportunity to trade this pattern is when you spot this pattern at the end of the downtrend, and the inverse head and shoulder pattern acts as a confirmation that the existing downtrend is weakening and there is a possibility that the market might reverse and move higher. But make sure that you don't trade this pattern in a very strong downtrend because the possibility of trend change is very low in such instances. Now let's move on to learning how to trade this pattern when you spot one. We will discuss the entry criteria first. The most aggressive entry is when the price breaks above the neckline or the resistance. The idea is to wait for the breakout candle to close above the neckline and then take a long entry above the close price or the high price of the breakout candle. The advantage of this technique is that you will be able to enter into the trade very early and perhaps you will get the best possible entry price, but the main drawback is that the price could reverse and give a false breakout and might even hit your stop loss. The second entry technique is a breakout with build-up. Now this happens when we observe a tight consolidation of prices near the resistance level or neckline. So when you see a build-up at the resistance, it tells you that there is buying pressure willing to buy at higher prices despite profit taking and short selling from that level. Also, the traders who went short at that resistance level are likely to have their buy stop loss orders above the resistance level. So when the price breaks out of the resistance, these clusters of stop losses will provide fuel to push the prices even higher. And if the market breaks out above, you can straight away enter into a long trade, or you can wait for the candle to close and enter above the close or above the high of the breakout candle. The advantage of using this method is obviously the tight placement of stop losses and an improved reward to risk ratio and also a very good entry price. But the main drawback is when the range of the breakout candle is very huge and you will be buying at a much higher price. Now what if the market doesn't form a build-up, or it forms a huge breakout candle and still continues to head higher? So if you miss both the above entries, the other method is to wait for a primary pullback in prices to happen. This technique helps you to catch the price move even after a breakout. So if the market breaks out without forming a build-up, then we will wait for a primary pullback to occur, which is a temporary down move of prices with weak candles. And if the market does form a pullback, then you can look to go long on the break of the previous swing high or enter right away when the prices starts rising. And as I have mentioned, the best pullbacks are the ones with shallow retracement and small bodied candles. But what if we get a steep pullback with large bodied candles? What would we do then? So if the pullback is very deep, then we will wait for the price to retest the neckline or the previous resistance turn support level where we expect the buyers to come in. We need to observe if the price retests the neckline, and if it does, we will wait for a price rejection from the neckline in the form of bullish reversal candlesticks like bullish hammer, bullish engulfing pattern, morning star, etc. And if you find there is a rejection, then you can go long on the very next candle. Now this retest technique lets you time your trade entry and even take up positions at better prices. But the downside is that there is no guarantee that the price will retest the level, especially if the market is in a strong uptrend, and you might miss out on the trade altogether. Yet another important point to keep in mind is that the volume should decrease during the formation of the left shoulder and head, indicating a loss of interest in selling, and the volume should rise during the formation of the right shoulder and also during the breakout, confirming an increase in the buying pressure. So make sure you use the right entry techniques at the right times. This is exactly where you should reference your stop loss. So if your entry was very aggressive as and when the price breakout from the neckline, then you should set your stop loss at or below the right shoulder of the pattern. Now what if you took a long entry after a build up near the neckline? Then you have the convenience of placing a much tighter stop loss, preferably just below the build up, which will in turn improve your reward to risk ratio. Now let's say you have missed both these entries and you entered a position in the market after the prices formed a primary pullback. Then set your stop loss below the lowest price in the group of pullback candles, including the wick, or place it just above the neckline if the pullback formed is very close to the neckline. Now the last method is if you are entering the trades after a retest. In this scenario, the stop loss can be placed just below the lowest wick of the group of retest candles, or you can be more conservative and place your stop loss below the right shoulder of the pattern to save yourself from long wicks. Now we will take a look at how to exit from our trade for maximum profits. And as previously mentioned, there are three popular techniques that you can make use of: the price projection method, trading stop loss method, and a combination of both these methods. The price projection helps determine where the price move might possibly exhaust. Now here's how it works. Just calculate the distance between the head and the neckline. Then project this distance upwards from the breakout point or neckline. This projected price point is where you should exit your trade. This price projection technique helps decide whether it's too late to enter a trade or not. And if the price is very close to reaching the price projection, then there's probably not much juice left in the move and you might want to skip the trade. But unlike the price projection technique, a trailing stop loss method does not use a fixed target profit. Instead, you trail your stop loss as the price moves in your favor so that you can ride the entire trend. So in order to do that, the first step is to decide on the type of trend you want to capture, whether it's a short-term, medium-term or long-term trend. Then you can trail your stop loss with the appropriate moving averages like 20 period for short-term, 50 period for medium-term and 200 period moving average for long-term trades. You will exit the trade only when the price closes below the moving average. Now the last method uses a combination of both these methods, and you will exit half your positions at the price projection level and ride the rest using the trailing stop loss. By doing this, you will be able to lock in some of the profits and not fall prey to the market reversals. Let's move on to the third pattern, which is the double top pattern. Now this is one of the most common chart patterns that you will encounter. So this is a good thing because you will get a good number of trades. But this is also a bad thing because which trades to select will be a big concern. So we will discuss the basics of what a double top pattern is, how it works, and how you should go about trading it. Now, a double top is a bearish reversal chart pattern and it consists of three parts. The first peak or the first price rejection, the second peak or the second price rejection, and the swing low forms a neckline or an area of support. Now what does the double top chart pattern really mean? The first peak is formed as a result of the market doing a pullback. At this point, you can't tell for sure if it will be a reversal, as pullbacks are very common in trending markets from time to time. This is followed by a second peak where the prices get rejected in the same area again, indicating that the buyers are not very keen to buy at higher prices. Now this is the first sign that the market could reverse lower, and the break below the neckline will confirm our bias that the sellers are in control and the market could continue lower. So in essence, the double top chart pattern signals a possible trend reversal as the market is unable to move higher. But keep in mind that not all double top chart patterns are created equally. For example, if you spotted a double top when the market is in a strong uptrend, the chances are the market will continue heading higher, and the last thing you want to do is to go short or trade against the trend just because you have spotted a double top chart pattern. So there are two important things that you must pay attention to when trading a double top chart pattern. First of all, you need to see where and how the pattern forms, and secondly, how long does it take to form or the duration it takes to form the pattern. As I have already mentioned, you don't want to short a double top against a strong uptrend. And in addition to this, the space between the first and second peaks is also an important factor worth considering. This means you should probably avoid double tops with both their peaks very close to one another. Instead, we want to trade those double tops when the space is far apart from the first and second peak. And why does the space between the peaks have to be so far apart? The reason is quite simple. When there is more time and space between the first and second peaks, these swing levels or peaks become more significant as more traders will become aware of the price level. And as you may have already guessed, when a level receives more attention, it attracts more order flow as more traders would want to trade around that area. So when a large group of traders gets it wrong, it presents an opportunity that we can take advantage of. So beware of trading double tops and double bottoms when trading on an intraday basis over a shorter time frame. The higher the time frame and the larger the space between the swing highs, the greater the chances of a successful pattern. Now most trading gurus will tell you to short the double top breakout when the price breaks below the neckline, and they will ask you to set the stop loss above the highs. However, there are two issues with this approach. First of all, after a strong move lower, the market could reverse higher, proving to be a false breakout and thereby hitting a stop loss. Secondly, the stop loss is inherently very large and it does not offer a favorable reward to risk ratio on your trade. So there are a few ways that you can think of to fix this. Let's start by discussing the trade entry criteria first. Now, the most aggressive entry is when the price breaks below the neckline or the support level. The idea is to wait for a breakout candle to close below the neckline and then take a short entry below the close or the low price of the breakout candle. Now, waiting for the candle to close will ensure that the candle closes below the neckline and suggests that it is not a false breakout. The other advantage of this technique is that you will be able to enter into a trade at a very early stage, but the drawback is that the size of the breakout candle can be too large sometimes, which can badly reduce your reward to risk ratio. In some cases, it is always beneficial to wait for a price build-up to form near the neckline, which acts as a support level in this pattern. Now we will take a short trade when the price breaks below the neckline after the build-up. This will ensure a higher probability of success because the trader who are long near the neckline or the support will have their stop loss orders placed below the support level, and this will cut their losses if the market continues to head lower. And once price breaks below the support level, all these sell stop loss orders will be hit, which will add further selling pressure, thereby increasing the probability of success. On top of that, this trade will ensure a more favorable reward to risk ratio as you will have a much tighter stop loss. Anyway, the problem with this approach is that the breakout candle can be too large, and also the fact that only a limited number of trades are available. Now, what if you miss the breakout trade? Is it the end? Not really. You can still enter a trade if the prices form a primary pullback in the form of a flag or a pennant pattern. A primary pullback is nothing but a temporary up move of prices with weak candles, most probably due to profit booking. And a good pullback is always shallow and is associated with weak candles. But what if we get a steep pullback with large bodied candles? What will we do then? Yet again, we can look for a retest of prices back to the neckline, which will now behave like a resistance level where we can expect to find the sellers to come in. So if the price do the retest, then we will wait for a price rejection from the neckline in the form of bearish reversal candlesticks like shooting star, bearish engulfing pattern, evening star, etc. And if you find there is a price rejection, you can back yourself to take a short entry as the price begins to move lower. The retest entry provides a better entry price than any other entry methods, but the downside is that the prices don't always give a retest, and especially in strong trending markets, you don't expect pullbacks or retests. Above all, make sure to confirm the breakouts with higher than average volumes and using other momentum indicators like RSI, MACD, etc. Your stop loss should be at a level that if breached will invalidate your trading setup. Since we are trading a double top pattern, our stop loss should be at a level that invalidates the pattern altogether. In that sense, if the price moves above the swing high of the pattern will be invalidated. But there is a small twist. Number one, if we do this, the stop loss can be too large and so the reward to risk will be very low. Secondly, the market can move up to the top of the resistance level and then reverse lower after hitting your stop loss just to form a triple top pattern and then move lower, completing the pattern, which can be really frustrating. So what I recommend is to either place your stop loss at 50% level between the swing top and the neckline, or if this distance is too large, then set your stop loss with an adequate buffer using the ATR indicator just above the breakdown candle high. This could be your stop loss. Your entry was very aggressive, that is, you went short as and when the price broke below the neckline. Now what if you took a short entry after a build up near the neckline? Then you get the freedom to place a much tighter and hassle-free stop loss, preferably just above the build-up or consolidation, which will boost your reward to risk ratio. Now let's say you miss both these entries and you shorted the market after the prices formed a primary pullback. Then you set your stop loss above the highest price in the group of the pullback candles or just above the neckline if the pullback is formed very close to the neckline. Now the last method is if you are entering after a retest. In such a scenario, the stop loss can be placed just above the highest wick of the group of retest candles, or you can be more conservative and place the stop loss at 50% of the width of the pattern. Now how to set your targets? As you may have guessed, there are 3 techniques to exit your trades: price projection, trailing stop loss, and a combination of these 2 methods. Let me explain each one of them. The price projection focuses on price exhaustion. The idea is that prices will move an equal distance to the highest width of the pattern after the breakout. Now, the highest width of this pattern is from the neckline to the swing top or the swing high. So all you have to do is to identify the distance from the swing top to the neckline. Then project this distance from the neckline towards the downside. This will give you your desired profit target. The second method of trailing your stop loss is to ride big moves. We will make use of moving averages of different periods to do this. And the selection of moving averages will depend on the time frame that you are trading on. So for capturing short-term trends, you use a 20-period moving average. For a medium-term trend, you use a 50 moving average. And for a long-term trend, you use 100 or 200 moving average. And we will exit the trade only when the price moves below the trailing stop loss. Now the last method uses a combination of both these methods. The idea is to exit half your positions at the price projection level and then ride the rest of the move using a trailing stop loss. By doing this, you will be able to lock into some good profits and not fall prey to the market reversals. Now, there is one more important piece of information that I want to share, which is associated with finding and trading double tops with a high level of accuracy and win rate, which involves the use of multiple time frame analysis. The concept is rather simple. The first step is to identify a downtrending market or a downtrending price action on a higher time frame depending upon your trading style. I have already made a video on time frame selection. You can watch that video to learn more. Now what you need to do is to wait for the price to approach an area of resistance on the higher time frame. Now if you find such a setup, move down to your lower time frame, then look for a double top pattern on the lower time frame. This is a very simple yet effective technique that allows you to time your trade entries at the absolute highs of the double top pattern, which by the way is the best possible price level that you can get and is also a professional way of trading this pattern. So please keep in mind that if you're not comfortable using this, then you'd be better off ignoring it. You don't necessarily have to consider all the options, just choose one or two that work well for you. Now we will focus on what a double bottom pattern is, how does it work, and how to approach it while trading it. A double bottom pattern is a bullish trend reversal pattern and it is the exact opposite of a double top. This pattern also has 3 parts. It has a first low or first price rejection, followed by a second low or second price rejection, and also a neckline, which is an area of resistance connecting the swing high in between. Now what do this part of the pattern indicate? A first low is formed and the market declines lower, forming a swing low and then moving higher. At this point, it is likely a retracement in the downtrend. But then a second swing low gets formed when the market rejects the previous swing low level and retraces higher again. So we can now assume that there is buying pressure, but it is too early to tell if the market could continue higher. We can only confirm the strength of the buying pressure when the price breaks above the neckline. Now when the price breaks above the neckline or resistance level, it signals the interest in buying and the possibility of the market moving higher. So in short, the double bottom pattern signals that the downtrend has possibly bottomed out and the price is about to move higher. Many traders make this mistake of buying the break of the neckline after a double bottom pattern is formed. But this won't always work in your favor, because if the market is in a strong downtrend and it forms small double bottoms every now and then, the chances are the market is likely to continue lower. In addition to this, not all double bottoms are made the same. The time frame that we use for spotting the pattern and the space between the swing lows or the swing bottoms are also important factors worth considering. So a double bottom pattern formed on a higher time frame is more significant than one formed on a smaller time frame. Moving on to the entry criteria for trading. So an aggressive entry is when the price breaks above the neckline or resistance. The idea is to either enter a long position on the breakout, which can often cause the false breakout problem, or you can wait for the breakout candle to close above the neckline and then take a long entry above the close or the high price of the breakout candle. The advantage of this technique is that you'll be able to enter into the trade early and might even get the best possible entry price, but the drawback is that the breakout candle could be too large, or even the price could reverse and give a false breakout and hit your stop loss. The second entry technique is a breakout with build-up near the neckline. This happens when we observe a tight consolidation of prices near the resistance level or neckline. So when you see a build-up at the resistance, it tells you there's buying pressure and people are willing to buy at higher prices despite profit taking or short selling from the level. Also, traders who short from the level are likely to have their buy stop loss orders placed above the resistance level. So when the price eventually breaks out of the resistance, all these clusters of buy stop loss orders will be hit, and it will provide the boost that the price needs to move higher. And if the market breaks out of the neckline, you can enter your long trade just above the close or above the high of the breakout candle. Now the advantage of using this method is obviously the tight placement of stop loss and an improved reward to risk ratio, and also a very good entry price. But the drawback is that the range of the breakout candle can be huge and you will be buying at a much higher price. Now what if the market does not form a build-up, or it forms a huge breakout candle and still continues to head higher? So if you missed both the above entries, the third method is to look for a primary pullback in prices to happen. This technique helps you to catch the price move even after a breakout. So if the market breaks out without forming a build-up, then we will wait for a primary pullback to occur, which is a temporary down move of prices with weak candles. And if the market does a pullback, then you can look to go long on the break of the previous swing high, or enter right away when the prices start rising. Now the best pullback should have a shallow retracement with small bodied candles. But sometimes we get a steep pullback to the neckline. This is called as a retest. So when the price retests to the neckline, or now a support level, we expect buyers to come in. So we need to observe if price retests the neckline, and if it does, then we wait for a price rejection from the neckline in the form of bullish reversal candlesticks like bullish hammer, bullish engulfing pattern, morning star, etc. And if you find there is a price rejection, then you can go long on the next candle. Now the retest technique lets you time your trade entry and even take up positions at far better prices. But the downside is that there is no guarantee that the price will retest to the level, especially in a strong uptrend, and you might miss out on the trade altogether. Yet another important point to keep in mind is that the volume should increase during the breakout, confirming an increase in the buying pressure. So make sure you use the right entry techniques at the right times. Now let us talk about the placement of stop losses with respect to our entry criteria. The double top pattern becomes invalid when the price reverses from the neckline and closes below the swing low of the pattern. And if you were to place your stop loss based on this idea, then the stop loss would be too large and you will incur huge losses, and moreover the price could reverse from the swing low and move higher again, forming a triple bottom pattern. So where exactly should you place your stop loss? Now what I recommend is to either place your stop loss at 50% level between the swing bottom and the neckline, or if this distance is too large, then set your stop loss with adequate buffer using the ATR indicator just below the low of the breakout candle. This could be our stop loss if your entry was very aggressive, that is, you went long as and when the price break out of the neckline. Now what if you took a long entry after a build-up near the neckline? Then you have the convenience of placing a much tighter stop loss, preferably below the build-up, which will in turn improve your reward to risk ratio. Now let's say you have missed both these entries and you have entered a position in the market after the prices formed a primary pullback. Then you can set your stop loss below the lowest price in the group of pullback candles including the wick, or you can place it just above the neckline if the pullback is formed very close to the neckline. And the last method is if you have entered after a retest. In this scenario, the stop loss can be placed just below the lowest wick of the group of retest candles, or you can be more conservative and place the stop loss at 50% of the distance between the swing low and the neckline of the pattern in order to save yourself from long wicks. And finally, we will discuss how to exit from our trade for maximum profits. And as always, there are 3 methods that we can make use of: the price projection, trailing stop loss, and a combination of both. The price projection calculates the distance between the swing bottom and the neckline. So in the price projection method, you have to calculate the distance between the swing bottom and the neckline. Then project this distance upward from the breakout point or neckline. The projected price point or level is where you exit the trade. This technique will help you decide whether it is too late to enter a trade or not. For instance, if the price is close to reaching its price projection, then there's probably not much meat left in the move and you might want to skip the trade. But unlike the price projection technique, a trailing stop loss method does not have a fixed target. Instead, we trail our stop loss as the price moves in favor so that we can ride the entire trend. So the first step is to decide on the type of trend you want to capture, whether it's a short term, medium term or long term trend. Then you can trail the stop loss with the appropriate moving averages like 20 period, 50 period or 200 period moving averages respectively. And we will exit our trade only when the price crosses below these moving averages. The final method combines both these methods. You exit half your positions at the price projection level and ride the rest using the trailing stop loss so that you will be able to lock in some profits and not lose money if the market reverses. Now same with the double top. You can use multiple time frames to filter for high probability double bottom setups. All you have to do is to identify a higher time frame support area, then move down to your preferred lower time frame and look for a double bottom pattern that leans against the higher time frame support level. By doing this, you can take a trade from the absolute low of the swing bottom, but do keep in mind that this is a more professional entry technique, so don't use it if you can't completely digest it. If you have understood the double top and double bottom patterns properly, then triple tops and triple bottoms are just a piece of cake. These are just extensions of the previous 2 patterns. The entry, exit and stop losses are the same, but what matters most is the formation of the third swing high or swing low respectively. Let's find out what these patterns signify. A triple top is a bearish reversal chart pattern that signals that the sellers are in control. The pattern starts with buyers in control as the price makes a swing high followed by a pullback. But the first sign of selling pressure appears as the price fails to break out of the prior high and the market makes a pullback again and forms a consolidation. This looks like a double top, but this time instead of breaking below the neckline, the market attempts to break out higher once again and fails again. So there are 3 spikes visible or 3 failed attempts to break out higher. This looks like a triple top and is confirmed only when the price breaks below the low of the consolidation or the neckline support level. I won't be discussing the entry, stop loss and target criteria because you can follow the same rules as with the double top pattern. Keep in mind that no patterns, strategies or techniques work all the time. This includes even the triple top pattern. But the good news is that before the pattern fails, it usually leaves some clues. For instance, if the higher time frame trend is still an uptrend, then the triple top pattern formed on a lower time frame is most likely to fail. Now when talking about a triple bottom pattern, a triple bottom is a bullish reversal chart pattern and is quite the opposite of the triple top pattern, and it signals that the buyers are dominant. Now the pattern begins with sellers pushing the prices down as the price makes a swing low followed by a pullback, but the first sign of buying pressure appears as the price fails to break out of the previous swing low. Now the market made another pullback and looked like a consolidation. This looks like a double bottom pattern, but instead of breaking above the neckline, the market attempts to move lower once again and fails to break the low once again. So there are 3 lows visible or 3 failed attempts to break out out lower. Now this looks like a triple bottom pattern and is only confirmed when the price breaks above the high of the consolidation or the neckline resistance level. The entry, stop loss and target criteria are similar to the rules of the double bottom pattern itself. Now moving to the last category of patterns, the wedges. We will start off with a rising wedge. A rising wedge is a popular bearish pattern. This pattern starts wide at the bottom and then contracts as the price moves upwards, and the trading range gets smaller towards the top. This pattern forms when the price consolidates between upward sloping support and resistance lines, where the slope of the support line is much more steeper than that of the resistance slope. What this implies is that the higher lows form much faster than the higher highs, leading to a wedge-like formation. This also means that the selling activity is gaining more traction and the buying activity is getting weaker. Also, the contraction of the trading range from left to right indicates a weakening of the existing trading activity. But the rising wedge can be one of the most difficult chart patterns to accurately recognize and trade. While it is a consolidation formation, like most other patterns, the loss of the upside momentum on each successive swing high gives the pattern its bearish bias. However, the series of higher highs and higher lows keeps the traders guessing that the trend is still bullish. This is where the contracting range helps us the most. Moreover, to identify it as a rising wedge, the price should test the upward sloping support and resistance lines at least twice each. Now, a shocking fact about rising wedge pattern is that it can be both a reversal or a continuation pattern. Now, it depends on its position in the price chart. But the more important information is that regardless of the pattern being a reversal or continuation in nature, rising wedges are bearish. This is what we will focus on. The added advantage is that we can spot this pattern at the end of an uptrend or as a consolidation due to a short-term profit booking during a downtrend. But actually, the bearish confirmation of the pattern does not come until the upward sloping support line is broken in a convincing fashion. Ideally, we expect the volume to decline as the prices rise and as the wedge forms, and there should be an expansion or rise in volumes on the support line break, which can be taken as a bearish confirmation. Now, you can also use momentum indicators like RSI or MACD to spot the shift in momentum. Anyways, when the price does break the support line convincingly, our bias is always towards selling on the breakdown. With a consolidation in prices, traders know that a big slash is on its way, so they expect a breakout either to the top or the bottom. So when the rising wedge is formed after an uptrend, it is referred to as a bearish reversal pattern, but if it is formed during a downtrend, it could mean a continuation of the down move. Now that we have learned how to identify a rising wedge, we can discuss how to trade the pattern. So I will discuss the entry methods, where to place the stop loss and how to set the targets. Now starting with the entry criteria, as it is a bearish pattern, we are only interested in the break below the upward sloping support trend line. You can take a short entry following a breakout of this level, that is, you can enter at the moment when the price breaks below the support trend line, or you can look to sell below the low price or even at the closing price of the breakout candle after it closes. The second method is to wait for a pullback or retest back to the breakout level and then take a short entry when the price moves lower or when the price moves below the breakout candle low. Now you are probably wondering, which one is better? Well, there is no best approach. If you enter at the break of the lows, it could be a false breakout, but if it is a real breakout, it is the best possible price you can get. Alternatively, if you wait for a close below the lows, then you will reduce the chances of a false breakout. But if the breakout is too strong, you will end up entering at a much lower price. The same is the case with waiting for a pullback or retest, which may not happen often if the market is trending strongly, and as a matter of fact, you will miss out on the trade completely. So it is up to you to decide the entry strategy and continue practicing it over a large number of trades. It is always recommended to confirm the validity of the breakout using volumes and other momentum indicators. So a higher than average volume can validate a breakout most of the time, as it shows the interest of the market participants, and low volume breakouts are most likely to fail. Also, using momentum indicators like MACD, RSI can also help you identify a true breakout. I have made videos on all these topics, so you can check them out. Let's now focus our attention on the criteria for setting the stop losses. how to set your stop loss when trading the rising wedge pattern. Now you don't want to set your stop loss at obvious levels like support and resistance, swing highs or swing lows, etc. And why is that? Because you will get stop loss 100 easily. Because these are as obvious a level to you as it is to others, including the smart money. So how do you get a proper stop loss setup? And it's very simple. As I have mentioned over and over again, your stop loss should be at a level that if crossed invalidates your trading setup. So we are trading a rising wedge pattern here, and the pattern is invalid if the price breaks and closes above the top trend line resistance. So you have to keep your stop loss above this resistance level. So there are still chances of long wicks which can take out your stop loss and then move in the desired direction. So to be extra safe, you have to give your trades more breathing space by setting your stop loss some distance away from the market structure using an indicator like ATR. So you have to set your stop loss 1 ATR above the most recent swing high level. Let's learn how to set a target for the rising wedge pattern. Now there are many ways you can cash in your winners. And one of the most common approaches is to have a predetermined profit target. Now the target can be measured by taking the distance of the back of the wedge or the widest portion of the wedge from the support to the resistance level and then extending this distance down from the trendline breakout point. You can also choose to trail your stop loss until the market takes you out of the trade. Now why is this a better option? Think about this. The rising wedge pattern usually appears in a downtrending market or at the end of an uptrend. In such conditions, there is a lot of potential for the trend to continue, and the only way to ride it is to trail your stop loss. Now to trail your stop loss in the best possible manner, you can use moving averages or Chandler's stops and only exit the trade if the market closes above it. Moreover, it is much better if you use a combination of both the price projection method and the trailing stop loss method so that you can gauge the move using the price projection method so as to lock in part of your profits there and then ride the rest of the position using a trailing stop loss, thereby not impacting your psychology and avoiding any losses due to reversals. Now moving on to the final chart pattern of this video, the falling wedge. Falling wedge chart pattern is like a counter pattern to the rising wedge. It is created when a market consolidates between two converging support and resistance lines. For a falling wedge, the support and resistance lines have to point in the downward direction or they should be sloping down, and the resistance level have to be steeper than the support level. The pattern generally starts wide at the top and contracts towards the bottom as the price moves lower. This sort of price action forms a cone-like shape that slopes down as the swing highs and swing lows converge. As the price continues to slide down, it will lose momentum and it signals that the buyers are beginning to step in and are slowing the rate of the price decline. Now in contrast to patterns like symmetrical triangles, which have no definitive slope or bias, the falling wedges should slope down and we have a bullish bias. Now, as with rising wedges, the falling wedges is also one of those challenging patterns to trade. The falling wedge is seen as both a bullish continuation and a bullish reversal pattern, which give rise to some confusion in the identification of the pattern. Now, both scenarios contain different market conditions that must be taken into consideration. But the differentiating factor that separates the continuation and reversal pattern is the direction of the trend when the falling wedge appears. A falling wedge is a continuation pattern if it appears in an uptrend, and it is a reversal pattern if it appears in a downtrend. However, this bullish bias cannot be realized or confirmed until the downward sloping resistance line breakout occurs convincingly. By convincing, I mean the volume should decline as the pattern progresses from left to right, or simply the volume should contract with contracting prices, showing a weakening of the existing price trend, and the breakout above the resistance line should be accompanied by higher than average volumes, indicating a rise in the interest among market participants. Now, you can also make use of momentum indicators like RSI, MACD, etc. to confirm the reliability of the pattern. Now we will talk about the entry criteria. So how do you better time your entry? The first approach is to go long when the price breaks above the resistance trend line. All you need to do is to place a buy order above the resistance line and you will be immediately long when the price breaks out above the level. And if the breakout is real, this is one of the best prices to enter. But this is a very risky method and chances are it might be a false breakout. Now this next method is similar to the previous approach. The only difference is that you wait for the price to break and close above the trendline resistance. You can take a long entry above the breakout candle highs once the candle closes. Now this will reduce the likelihood of a false breakout, but if the price momentum is strong, you will enter your trade at a much higher price. Now if you are an experienced trader, then you can even enter the market as the price pull back or retest back to the upper trend line of the pattern. This can help you enter the trade even if you miss the breakout move, and it offers a better price entry than waiting for the close of the breakout candle. But the issue with this approach is that market may not give a pullback or retest every time. So once again, you can choose the entry type that you like based on whether you are conservative or aggressive in your approach. But make sure to validate the breakout with volumes and other momentum indicators to see if there is actually an interest in the market participants to take the prices higher. Now how to set a proper stop loss so that you don't get stopped out too early. Now it doesn't matter whether you are trading breakouts or pullbacks because the concept is the same. Your stop loss must be at a location that if breached will invalidate your trading setup. This means if the market hits the stop loss, you will automatically know that you are wrong. So a stop loss below the resistance level is not a good idea. Where else then? Think about it. Where is the ideal place to set your stop loss so that if the market reaches it, you know the falling wedge pattern is invalidated. Since the pattern forms higher swing lows, and if the price moves below the recent swing low or break below the downward sloping resistance trend line, then we can be sure that our analysis was wrong. So this is exactly where you need to keep your stop loss, that is just below the swing low or the support level. Now you can give the price some breathing space by adding one ATR buffer below the recent swing low or the support. I hope this is clear. Now how to cash in your winners? Now, one of the most common approaches is to have a predetermined profit target. Target can be measured by taking the width of the top of the wedge or the widest portion of the wedge from the support to the resistance level and then extending this distance upward from the trendline breakout point. You can also decide to trail your stop loss. Now the trailing stop loss helps you ensure you ride the entire trend. Now to trail your stop loss in the best possible manner, you can use moving averages or Chandler stops and only exit the trade if the market closes below it. And if you are using the moving averages, use 20, 50 or 200 period moving averages depending on whether you have a short term, medium term or long term trade objective. Moreover, it is much better if you use a combination of these two methods so that you can gauge the potential of the move beforehand using the projection method so as to lock in part of your profits there and then ride the rest of the position using the trailing stop loss method, thereby not impacting your psychology and avoiding any potential losses due to reversals. Now that is all the major reversal patterns in a single video. In the previous two episodes, we have discussed the most important continuation and reversal patterns, how to identify them, and how to trade them in a very detailed manner. When dealing with both continuation and reversal patterns, we have a clear idea, or maybe we have a directional bias towards where the breakout will happen. That is, in the case of continuation patterns, we will look to trade in the direction of the previous trend before consolidation. And for reversal patterns, we will look to initiate trades in the opposite direction of the prior market trend. But the third type of pattern that we are going to discuss doesn't have a directional bias associated with it when it comes to the breakout or the trade direction. Or in simple terms, the breakout of the pattern can be in either direction and we cannot judge the direction of the breakout before it happens. This category of chart patterns is called as neutral chart patterns or bilateral chart patterns. Since we cannot be sure of a possible breakout direction, these patterns can be dangerous because of false breakouts. More often than not, you will find yourself entering a breakout above or below the pattern consolidation only to see yourself fall prey to a false breakout. I have already made videos on breakouts and false breakouts in my price action course. You can check those videos to know more. In this part, we are going to discuss 3 bilateral patterns, how they work, and how to take trades, including the entry, targets, and stop losses. Now, the 3 bilateral patterns under discussion are: number 1, the symmetrical triangles, followed by the symmetrical expanding triangles or broadening triangles, and finally channel patterns, that is rising channel and falling channel patterns. If this series of videos are helping you become better at trading, then please do like and share this video and support our efforts to build a healthy trading ecosystem. So let us start our discussion with symmetrical triangles. We have talked about ascending and descending triangles. The ascending triangle indicates a weakening of sellers with a contraction in volatility from left to right of the pattern, while a descending triangle signals a weakening of buyers and a decline in volatility, which leads to a strong breakout. Now, the working of a symmetrical triangle chart pattern is quite similar to these two triangle patterns. The symmetrical triangle is also a volatility contraction pattern, but here we are not sure who is the weak player. A contraction in volatility means that the price volatility in the market is shrinking, and it is a strong signal that the market is likely to break out soon. Now, before we get into the breakout part, let's first learn how to identify a symmetrical triangle pattern in the charts. I hope you're familiar with the fact that for an ascending triangle, there is an ascending trendline support and a flat resistance line, while for a descending triangle, there is a descending trendline resistance and a flat support line. Now, when it comes to a symmetrical triangle, and as the name suggests, the sides of the triangle slope equally, which means the slope of the ascending trendline support and the descending trendline resistance happens to have the same slope. Now, it is within these trend lines that the actual consolidation of prices happens, and both of these trend lines meet at a common point called the apex. Now, the triangle should comprise of at least 2 lower highs and 2 higher lows each to be considered as a valid symmetrical triangle pattern. The pattern looks like a funnel with the price squeezing from left towards the right with a contraction in volatility, which is associated with weakening of candlesticks and price action. Now, what does the price action indicate? It simply means that neither the buyers nor the sellers are interested in buying or selling. This is evident from the lower highs forming the upper trendline resistance, showing a lack of buying pressure, while the higher lows into the lower trendline support signals a decline in selling pressure. As you can see, the pattern started with big swings, which got shorter and shorter as the pattern progressed. The beauty of volatility contraction is that price cannot be squeezed forever. At some point, it must break out, and when it happens, it offers tremendous returns. Now, I have seen many experts believe that if a stock is rallying before the formation of a symmetrical triangle, it will eventually break out to the upside. On the other hand, if a stock falls before a symmetrical triangle consolidation forms, it should continue its decline after the breakout. Now, both of these assumptions are not right. These triangles offers little or no indication regarding the direction in which the stock or the index will eventually break out. Keep in mind that there is a lack of volume and price movement which gives rise to a symmetrical triangle pattern, and as a result, it is impossible to assess the direction of the breakout. Another common mistake traders make is chasing the breakout of a symmetrical triangle pattern, only to get trapped in a false breakout. So how do we eliminate this mistake? A great trading tool that you can use for identifying breakouts is volume. Real breakouts usually occur with high trading volumes and high volatility, while fake breakouts are usually associated with low volumes and look more like a range than a breakout. Since the levels of the triangles are inclined, it sometimes brings the price outside the frame of the triangle. This usually gets traders tempted and they assume that there is a breakout on the chart. So always make sure to confirm the breakouts. Another important point that you can keep in mind is that the closer the price gets to the apex of the pattern and the tighter the price consolidation becomes, the greater the chances of a real breakout, and the price will quickly move in favor of your trade. Moving on, we will now focus on how to trade this pattern. That is, how to time your entry, set your stop loss, and determine targets or exits. Let's start with the entry criteria first. Now, wherever this pattern forms, we have to consider two scenarios. First is a breakout above the descending trendline resistance, and the second scenario is a breakout below the ascending trendline support level. Let's say the price breaks the upper trendline resistance level. Then you have 4 possible long entries available. The first approach is very aggressive, and the idea is to go long as soon as the price breaks above the resistance trendline. And all you need to do is to place a limit buy order above the resistance level, and you will be immediately long when the price breaks out above the level. And if the breakout is real, this is one of the best prices to enter. But this method is very risky, and there are high chances that it might be a false breakout. The second method is similar to the previous approach. The only difference is that you wait for the price to break and close above the descending trendline resistance. You can enter long above the breakout candle highs once the candle closes. This method reduces the likelihood of a false breakout, but if the price momentum is strong, then you will be probably entering at a much higher price. Now, if you have missed both these entries, then you can even enter the market as the price pulls back or retest the resistance line of the pattern. This method can help you enter a trade even if you miss the breakout move. In this method, we have to wait for the prices to form a primary pullback or even retest the resistance turn support level and then move in the direction of the breakout. So you can take a long position when the price begins to move higher. The retest entry offers a better price than waiting for the close of the breakout candle. Also keep in mind that pullbacks and retest are usually associated with smaller candles. But the issue with this approach is that the market may not always give a pullback or retest, especially if there is a strong momentum backing the price move. So I leave it up to you to decide the entry type that you like based on whether you are conservative or aggressive in your approach. Also make sure to validate the breakout with volumes and other indicators to see if there is actually an interest among the market participants to take the prices higher. The entry techniques for a breakdown below the ascending trendline support are also similar, but here our bias is bearish and we will look to enter a short position. So you can either choose to go short on the breakdown, or you can wait for a primary pullback or retest back to the support turned resistance level and then go short when the price starts to decline lower. But make sure to validate the breakout first using volumes and other momentum indicators to save yourself from being trapped in a false breakout. Now, how to set a proper stop loss so that you don't get stopped out too early. Now, the concept is simple. Your stop loss must be at a location that, if reached, will invalidate your trading setup. This means that if the market hits the stop loss, you will automatically know that your analysis was wrong. So if you talk about the stop loss placement for a breakout above the resistance level, do you think setting your stop loss just below the resistance level is a good idea? Well, I don't think so, considering the chances of fake outs or even deep wicks. So where else should you place it? Think about it. Where is the ideal place to set your stop loss so that if the market reaches it, you know the breakout is invalidated? Now, since the pattern forms higher swing lows, and if the price moves below the recent swing low and forms a lower low, then we can be sure that our analysis was wrong. So it is exactly the place where you need to keep your stop loss, that is just below the recent swing low. You can give the price some breathing space by adding one ATR buffer below the recent swing low to compensate for the deep stop loss hunting wicks. Now the same idea applies to a breakdown below the ascending trendline support. You can place your stop loss just above the most recent swing high level formed, or you can give one ATR buffer above the swing high level to be extra safe. Now, where to exit your winning trades for maximum profits? You may already be familiar that there are two techniques that you can consider: the trailing stop loss method and the price projection method. Now, how to exit your trade at the price projection level? Now, price projection techniques helps to project where the price momentum will exhaust itself. So here's how it works for a symmetrical triangle pattern. All you have to do is to take the distance between the highest and lowest points of the symmetrical triangle, that is the widest distance of the pattern. Then depending on the breakout direction, copy and paste this distance or project this distance at the breakout point. For example, in case of a bullish breakout, project this distance to be above the resistance level from the breakout point, and for a bearish breakdown, project the same distance to be below the support level from the breakdown point. Now, this will give you the price projection or the expected target level. Now, the concept of trailing stop loss is that we have no idea how long the trend will last. So we will trail our stop loss to ride the trend as far as possible to lock in gains as the market moves in our favor. So how do you actually trail your stop loss? Well, you can use an indicator like a moving average. For example, you can trail your stop loss using a 20 period, 50 period or even 200 period moving average, depending upon whether you are considering a short term, medium term or long term position in the market. This means you will hold your position until the market breaks and closes above or below the moving average, depending on the direction of the breakout. A more robust technique is if you make a trailing stop loss and price projection combo. That is, you combine both these techniques. This means if the market moves in your favor, but it has not reached your price projection level, you can use the moving average to lock in your profits. So even if there is a sudden reversal, you still protect what you have and do not give everything back to the market. Moving on to the second category of neutral patterns. This particular pattern is known by different names, be it a symmetrical expanding triangle or a broadening triangle pattern or a broadening bottom or top pattern, etc. The pattern looks exactly like a mirror reflection of a symmetrical triangle pattern. Now, instead of the price squeezing from the left towards the right, it actually expands with each swing. This is one of the reasons why this pattern is tougher to trade than other chart patterns, as the lows and highs get taken out one by one. It is also called a megaphone pattern because of the expanding shape of the consolidation. Now, when it comes to the identification of this pattern, the pattern can be formed during an uptrend or a downtrend, and it is referred to as a broadening top when it is formed during an uptrend and a broadening bottom when it is formed during a downtrend. When the two trend lines connecting the widening highs and lows of the prices diverge from each other, it is an indicating of a broadening triangle pattern. It shows the nervousness and indecisiveness of traders. Even though the price action is evident after each price swing, there is no clear dominance by a single player. That is, the buyers and sellers are trying to force their dominance, but each attempt is countered, resulting in a state of indecision. Moreover, there should be at least two price swings along the sloping trend lines. That is, there should be at least two higher highs into the ascending trendline resistance and two lower highs into the descending trendline support to consider it as a valid pattern. Now, similar to a symmetrical triangle pattern, in the broadening triangle pattern too, the breakout determines the direction of future price movement. Please note that there are a few categories of broadening patterns, be it broadening wedges, broadening tops with a flat support line, or broadening bottoms with a flat resistance line. But I will not be discussing these patterns because most of these broadening price action patterns occur rarely in the market. So I will always urge you to follow 3 to 4 strong patterns rather than running after each and every pattern on the charts. The more focused you become, the better the results will be. Now let's talk about the trading criteria, and let's start with the entry techniques first. As I have just mentioned, the breakout determines the future price direction and dominance of a single player in the market. This pattern does not come with a directional bias. So we have to focus completely on the breakouts to determine our position. So it all comes down to identifying a real breakout. As discussed earlier, one of the factors that will help determine a proper breakout is the volume. So a higher than average volume can be a good indication of a probable breakout. Moreover, you can make use of momentum indicators like RSI, MACD, etc. to validate a breakout from a false breakout. So with that in mind, let's talk about all the possible entries when a breakout happens above the upper trendline resistance. You can take a long entry as soon as the price breaks above the resistance, as this will give you a good entry price. But the downside is that it could be a false breakout and you could get trapped. So a better alternative would be to wait for the breakout candle to close above the resistance trend line and then enter at the opening of the next candle or above the high of the breakout candle. Now the problem with this approach is that if the breakout is associated with a good momentum, then you will find yourself buying at a very higher price. In addition to these, you can take a long position after a price pullback or retest back to the ascending trend line. As you may all know, a pullback or a retest is usually associated with weak candles. So you can take a long trade when the price begins to move in the direction of the breakout once again. The advantage of these methods is that you could get into a trade even if you miss the breakout. But on the downside, a pullback or retest does not happen every time, particularly if there was a strong price momentum during the breakout. Now the same entry methods are applicable in case the price breaks down below the lower trendline support of the pattern. In that case, you can take a short entry on the breakdown or after the breakdown candle closes below the support level. You can also enter a trade after a pullback or retest to the lower trendline support. Now talking about stop losses, placing stop losses for this pattern is actually a hard task. If you were to go by the general idea of placing the stop loss, it can be set below the top resistance line or below the lower support line in case of a bullish breakout, and on the other hand, a stop loss could be placed above the lower support line or above the upper trend line resistance for a bearish breakdown. But think about it. One of the stop loss is too tight and any price swing with long wicks can take out your stop loss, while the other stop loss is too wide, which will give you a poor risk to reward. So what will we do? One way to counter this issue is to place your stop loss in the middle of the pattern, that is at the center of the widest point of the pattern. So if you are very aggressive with your stop loss, you could even place the stop loss with respect to the breakout candle, provided you give enough breathing room for the price action to happen. This can be achieved if you place your stop loss by adding some buffer with anywhere from 1 to 3 times the ATR value. Now finally, we will be talking about the targets. For this pattern, I won't be really interested in trailing my targets. I'm satisfied with the projected targets. So you can set 2 targets using the price projection method. The first target would be equal to the distance of the smallest swing between the top and bottom trend lines. This distance is further projected above or below the trend line depending on whether it was a breakout or a breakdown. The second target level will be equal to the distance of the widest swing between the trend lines, which is projected from the breakout point. Now let's move on to the final type of bilateral pattern, which are channel patterns, namely the rising and falling channels. The channel pattern is also known as the price channel. The formation of the pattern is quite interesting and it is related to market trends. You can learn all you need to know about market trends in my price action course. Now let's talk about the rising channel first. The rising channel is formed by 2 lines, a bottom trend line support and an upper trend channel line resistance. So clearly the price is in an uptrend, and as you may already know, during an uptrend, price forms higher swing highs and higher swing lows. And when we connect all the swing lows together using a line, we get the uptrend line, which will act as a support for the prices. And if we connect all the higher highs, it will give us the trend channel line, which will act as a resistance level for the future prices. Moreover, we need at least 2 price swings on each of these lines to consider it as a trend line, and to confirm it as a valid line, we need at least 3 swings on each of them. Now, another important thing to keep in mind is that the lines should be parallel to each other, or in simple terms, the slope of both the upper and lower lines should almost be equal. And if the slopes are different, we know what it means, right? It will be a different price action altogether and it will form a rising wedge pattern. Let's now talk about the falling channel pattern. The existing trend is a downtrend with lower highs and higher lows. By connecting all the lower highs together, you will get a downtrend line, which will act as a resistance level for the future price movements. On the other hand, if you connect all the lower lows, you will get a trend channel line, which will function as a support level for prices. Also keep in mind that the slopes of both these lines should be almost equal, or in simple terms, the line should be parallel. Now let's talk about how to trade a rising channel pattern. So you can take 2 types of trades when it comes to rising channel patterns. You can either take breakout trades when the price breaks out of the channel, or else you can trade the impulse price swings in the direction of the existing trend from the trend line. When it comes to breakout trading, the rising channel pattern is a bilateral pattern, meaning that a breakout can happen in either direction. But what I have observed is that the slope of the channel to some extent gives us the information on whether it will be a breakout or a breakdown. Let me explain. A channel with a very high slope or a very steep price action will mostly break down below the support trend line, while a channel with a medium or lower slope will have equal chances of breaking out or breaking down. Anyway, this is just an observation, but we should enter a trade only after a breakout has happened. Let's say the price broke below the support trend line. Now, if you are very aggressive, you can take a short position as soon as the price breaks below the support trend line. But this is risky as it could end up being a false breakout and you will get trapped. So it is always ideal to wait for the breakout candle to close below the trend line and then enter on the opening of the next candle or below the low of the breakout candle. Now the downside is that if the breakdown is strong, you will end up selling at a much lower price. So yet another method would be when the price pulls back or retests back to the trend line. So both the pullback and retest are associated with small bodied candles. So when the price starts to move lower after the pullback or retest, you can take a short entry. Sometimes there could even be a price build-up near the support trend line, which is a very good signal that the price would break down lower, and it provides a much better reward to risk because of a tighter stop loss. Now all these breakdown entry techniques are applicable even if the price manages to break out above the resistance trend line. In such a scenario, we will look for long trading opportunities either after the breakout and close above the resistance, or after a build up near the resistance trend channel line, or even after a pullback or retest back to the trend channel line after the breakout. Now one of the most important factors to check out is the volume. So if you want to know more about analyzing volumes, you can check it out in my free price action playlist. Anyway, there should be a higher than average volume during breakouts. You can even use momentum indicators like RSI to validate the breakout. Moving on, let's learn how to place your stop loss. We will discuss the stop loss for a breakdown below the support level. The stop loss of the channel pattern will depend upon the width of the channel. If the channel is too narrow, then we can think about placing the stop loss just above the upper trend channel line. But if the channel is too wide, then we need to think about a different stop loss, because if we place it above the trend channel line like before, the reward to risk ratio will be severely affected. So what can be done? For a breakdown entry, we can place the stop loss just above the midpoint of the channel from where the breakout happened. But if you have taken a short entry after a build up near the support trend line, then you can keep your stop loss just above the build up or consolidation. And finally, if you have taken a position after a pullback or retest, then you can set your stop loss above the highest wick of the pullback or retest candles with some buffer for price action. Now in case of a breakout above the resistance trend line, similar stop loss conditions can be applied there also. But in this case, we will be placing the stop loss below the midpoint of the channel from the breakout point if you have taken a breakout entry. Or you can place the stop loss below the consolidation for a breakout after build-up entry, and finally you can set your stop loss with some buffer below the lowest wick of the pullback or retest candles for a pullback or retest entry. Now let's discuss the targets, and as always we can follow three methods: price projection, trailing stop loss, and a combination of both. For price projection, we follow a price exhaustion concept. For a channel pattern, we measure the distance between the upper and lower trend lines and project this distance above or below the line depending on the direction of the breakout. This will give you your projected price target. Now, one interesting observation of the rising channel pattern when the price breaks down below the support trend line is that all the previous swing levels will act as price action areas. So you will have to closely watch what type of price action is occurring and then decide whether to hold your trades for more profitability or just exit your positions. Now the other method is to use a trailing stop loss using moving averages of different periods depending on the type of trading style that you follow. The central idea of this concept is that when a price breakout or breakdown forms a channel or simply a consolidation, there is a good chance that the trend will continue for a longer period, and you can benefit enormously if you trail your stop loss. You will exit the trade only when the price crosses the moving average. So for short-term trends, you can use 20-period moving average. For medium-term trends, you can use 50-period moving averages. And for longer-term trends, you can use 100 or 200 moving averages. But it is always a good practice if you use a combination of both price projection and trailing stop-loss methods, so that you will be able to lock into profits, whatever the outcome is. Now let's look at the second method of trading a rising channel pattern. This idea is only valid if the channel formed is wide enough. That is, there should be enough points between the support and resistance line. The idea here is to trade the impulse move or simply to trade in the direction of the trend. All you have to do is to look for buying opportunities from the trendline support level to ride the impulse moves, because impulse moves are associated with stronger momentum candles and you will be trading along with the market price flow. You can also make use of bullish reversal candlesticks like bullish pin bars from the support level to take a long entry. You can place your stop loss below the support trend line with ample buffer or below the lowest wick of the rejection candle from the support level. Your target will obviously be the resistance trend channel line. You can also trade the correction move from the uptrend line, but I don't generally recommend doing so. Now let's briefly discuss the trading criteria for a falling channel pattern. Similar to a rising channel, you can take two types of trades when it comes to falling channel patterns. You can either take breakout trades when the price breaks out of the channel, or you can trade the impulse price swings in the direction of the existing downtrend from the trend line. When it comes to breakout trading, the falling channel line is a bilateral pattern, indicating that breakout can happen in either direction. But same as before, the slope of the channel to some extent gives us the information on whether it will be a breakout or a breakdown. So a falling channel with a very high negative slope or a very steep price action will most probably break out above the resistance trend line, while a channel with a medium or lower slope will have equal chances of breaking out or breaking down. Anyway, this is just an observation, but you should enter the trade only after the breakout has been confirmed. Let's say the price broke above the resistance trend line. Now, if you're a very aggressive trader, you can take a long position as soon as the price breaks above the resistance trend line. But this is a risky business, as it could end up being a false breakout and you will be trapped. So it is always ideal to wait for the breakout candle to close above the trend line and then enter on the opening of the next candle or above the high of the breakout candle. The downside is that the breakout could be too strong and you will end up buying at a much higher price. So yet another method would be when the price pulls back or retests to the trend line. So when the price starts to move higher after the pullback or retest of the consolidation, you can take a long entry. Sometimes there could even be a price build-up near the resistance trend line, which is a very good signal that the price could break out higher, and it provides a much better reward to risk because of a tighter stop loss. All these breakout entry techniques are applicable even if the price manages to break below the support trend channel line. In such a scenario, we will look for short trading opportunities, either after the breakout and close below the support trend channel line, or after a build up near the support line, or even after a pullback or retest back to the trend channel line after the breakdown. Now, one of the most important factors to check out is the volume. You can validate a real breakout using higher than average volumes during the breakout, and you can even use momentum indicators like RSI, MACD, etc. to validate the breakout. Moving on, let's look at how to place your stop losses. So we will discuss the stop loss for a breakout above the resistance level. As mentioned earlier, the stop loss of the channel pattern will depend upon the width of the channel. If the channel is too narrow, we can think about placing the stop loss just below the lower trend channel line. But if the channel is too wide, then we need to think about a different stop loss, because if we place the stop loss below the trend channel line like before, the reward to risk will be poor. So for a breakout entry, you can place the stop loss just below the midpoint of the channel from where the breakout happened. But in case you have taken a long entry after a build up near the resistance trend line, then you can keep your stop loss just below the build up or consolidation. And finally, if you have taken a position after a pullback or retest, you can set your stop loss below the lowest wick of pullback or retest candles with some buffer for ample price movement. Now, in case of a breakout below the support trend channel line, similar stop loss conditions can be applied there also, but in this case, we will be placing the stop loss above the midpoint of the channel from the breakdown point if you have taken a short entry, or you can place the stop loss above the consolidation for a breakout after build-up entry. And finally, you can even set your stop loss with some buffer above the highest wick of pullback or retest candles for a pullback or retest entry. Now finally, let's discuss the targets. Setting the targets can be done the same way as with the rising channel pattern. It could be price projection, trailing stop loss, or a combination of both. So please do refer the previous session if you have any doubts. Now let's look at the second method of trading the falling channel pattern. As mentioned earlier, the idea is only valid if the channel formed is wide enough. There should be enough points available between the support and resistance trend lines. Now the idea here is to trade the impulse move or simply to trade in the direction of the existing market trend. So all you have to do is to look for selling opportunities from the trendline resistance level to ride the impulse move, because the impulse moves are associated with stronger momentum candles and you will be trading along with the market price flow. You can also make use of bearish reversal candlesticks like bearish pin bars from the resistance line to take a short entry. You should place your stop loss above the resistance trend line with ample buffer or above the highest wick of the rejection candle from the resistance line. Your target for this case will obviously be the support trend channel line. So you can also trade the correction move if you want from the lower trend channel line, but I generally don't recommend doing it. Now, there are a hell lot of other patterns that you can find in the markets, from rounding bottoms and tops or saucer patterns, followed by diamond tops and diamond bottoms, V tops, V bottoms, broadening wedges, island reversal patterns, etc. The patterns that I have discussed over the course of 3 videos are more than sufficient to trade profitably in the market if you follow them correctly. Now, it doesn't mean that all the trades will become profitable, but the probability of your trading success can be vastly improved. Moreover, the time frames that you select for trading these patterns also form an integral variable for the success of these patterns. And mostly the win rate of chart patterns tends to improve quite a lot if you trade them at higher time frames.
We went from discussing continuation chart patterns, followed by reversal chart patterns, and finally we have talked about neutral or bilateral chart patterns. Now, I am assuming you know how to identify and trade these chart patterns in the market. But one of the hardest things about chart patterns is spotting them on charts across different stocks and indices. Think about it. Chart patterns show up in different time frames, from intraday time frames to daily or weekly or even monthly time frames, and that too across different stocks and indices. So as a trader, you have 2 jobs. First, you have to identify suitable patterns of your liking. Maybe you like trading triangle patterns, or maybe you like pennants and flags and so on. So identify the pattern of your liking. I will suggest you follow 2 to a maximum of 3 reliable patterns rather than going after every pattern you find in the books. Trust me, it will do more harm than good. And if you ask me my personal favorites, then I would say triangles, rectangles, channels, and sometimes I even bet on head and shoulder patterns also. Now the next step is to filter out the good trades from the not so reliable ones. But trust me, it is an exhausting job to look for chart patterns over each and every stock, draw them, analyze them, and finally filter them for trading. So in this video, I will discuss 3 methods that you can use to spot chart patterns in the market. So watch the video till the end, because the methods for finding the patterns get easier as we proceed through the video. Before we discuss the different methods, let me make something clear up front. Let me explain the reasons why spotting chart patterns is a difficult task. Number 1, most charts are uneven and noisy. Most stocks and index chart consist of deep wicks, price gaps, false breakouts, overshoots and undershoots, all resulting in making the pattern determination a hard task. This is particularly true when we move to the lower time frames. What this means is that on a higher time frame like daily, weekly, etc., the chart pattern determination is fairly easy and forms slowly so that we get enough time to plan our trades appropriately. But this is not the case in lower time frames like 5 minutes or 15 minutes or even 30-minute charts, where the chart patterns get formed very often, but it is always tricky to mistake one pattern from another as it happens quickly, and often we won't be able to plan our trades adequately. Another point to keep in mind is that the more fluid the market price movements, the easier it is to spot these patterns. The point that I want to make is that forex markets, which are open all week long, are one of the best markets for pattern trading, unlike Indian indices like Nifty or Bank Nifty, where there are big price gaps and backlashes due to aftermarket sentiments. Due to this very reason, you can get good entries and exits due to regular price moves in forex, unlike stocks or indices, which can sometimes affect your trades due to unpredictable price gaps. But most of us like trading in stocks and indices, so it is important that we identify the pattern correctly and plan our trades beforehand. So let's discuss the very first method of doing this. The first method uses the inbuilt TradingView indicators for spotting chart patterns. This feature is only available in TradingView charts, so make sure you have at least a free account in TradingView. All you have to do is to select the chart of your liking, be it a stock or an index or a currency pair, and then select the time frame that you intend to trade the pattern in. So if you are an intraday trader, select an intraday time frame anywhere between 3 minutes to 30 minutes, or if you are a swing trader, go with a much higher time frame like 4 hours or 1 day time frame. Once you are done with these steps, go to the indicator section on the top toolbar section of TradingView, click on it, and as you can see on the left hand side, there are different options like favorites, community scripts, my scripts, etc. And you need to select the technical section. And once you do that, you will find a lot of indicators to choose from. But the ones that we are looking for are related to chart patterns. On the top section of this pop-up, you can see multiple options like indicators, strategies, volume profiles, etc. So click on the one that says Auto. Now as soon as you scroll down, you'll be able to see most of the chart patterns that we have already discussed, from flags, pennants, rectangles, both bullish and bearish, to double and triple tops and double and triple bottoms, to triangles, and finally we have head and shoulders and inverted head and shoulder patterns. Now you might be wondering, where are the ascending, descending and symmetrical triangle patterns? Don't worry, because all the triangle pattern variants are included under the same indicator. But unfortunately, this indicator section actually lacks patterns like channels, broadening wedges and triangles, etc. The next step is to click on the pattern that you want to check on the chart. Let us say I want to check triangle patterns, then I will simply click on the triangle patterns, and if we zoom out a little, you will be able to spot all the triangle patterns which are formed. And as you can see, there is no triangle formation as of now, but there was a triangle formed some time back which gave decent enough returns. Even though the indicator plots the patterns automatically, you are the one who is ultimately in control. So in order to change the parameters, just go to the settings of the indicator and click on it. Now a pop-up appears which gives a parameter called permissible deviation, and by default it is set to 10. And if you want to know what this is, just place the cursor over the I symbol just to the right of the parameter. Now this particular parameter is used to determine how accurate the pattern form should be. So if you reduce the permissible deviation to, let's say, 0 or even 5, then the number of triangle patterns displayed by the indicator reduces. And if you increase the deviation to, let's say, 25 or 40, then the number of patterns displayed will be more, but some of them will be inaccurate. So either stay with the default value or just play with the numbers and see what works best for you. Now just below the deviation parameter, you will find a tick box saying in progress. Once again, move the cursor over the I symbol. What it is asking you is that, do you want the indicator to spot incomplete patterns or those patterns which are in the process of formation? Now it is most important to always turn this checkbox on. Only then you will be able to track the upcoming patterns and plan and trade them with ease. And another thing is that when you move from a higher time frame to a lower time frame, the number of patterns spotted increases, but the accuracy of the patterns working out in your favor actually reduces. Now let us look at one more example. This time we will consider a double top pattern. And as you can see, once we have clicked on the pattern, it automatically displays all the potential double top formations. And another interesting thing to note is that this indicator will also give you the projected profit target beforehand. We know that the projected target is equal to the height of the double top pattern from the neckline to the top. Now this is exactly the target being displayed. Now let's select the setting icon of this indicator. And as you can see, there are more options available like the trend height, second top, and finally the permissible deviation. Now the trend height parameter is asking you for the minimum height of the prior uptrend, since we know that double top is a trend reversal pattern, particularly a bearish trend reversal pattern. So on a strong uptrend, a double top could be a minor retracement, while during a weak uptrend, it could be the start of a potential reversal. So play with the values to find the best combination. Now the next parameter is the second top, which means where do you want the second top to be formed? Do you want it exactly at the same height, or higher, or lower? Depending on this parameter, different double tops will be displayed on the chart. Now the final parameter is the permissible deviation, which refers to the extent to which the second top should vary from the first top. Now more this deviation, the more results will be displayed by the indicator, but with a lower accuracy. So try to maintain a tight deviation and always make sure to tick the in progress box to display ongoing pattern formations. So it is clear that different patterns have different settings or parameters. So it is your job now to select the indicator based on the pattern of your liking and fine-tune the parameters to achieve the best results. Now this method works well. It helps to identify patterns faster on different time frames and on different charts. But it is still a manual job, and let's say you need to check all the Nifty 100 stocks for potential chart patterns. How long do you think this process will take? Maybe hours, right? So this is exactly the drawback with these trading view indicators, as it has limited applications, shows lesser results on the chart because sometimes the indicator can be seen missing out on some of the patterns, so it is less reliable. So how to counter this problem of finding all the patterns on different charts on different time frames? Now one of the great contender for this spot is our method number 2, which is Top Stock Research Pattern Scanner. This is an automatic screener that looks for chart patterns. Once you're in the website, go to the option that says Pre-screened and a drop-down menu appears. From the drop-down, select Chart Patterns. This will take you to the chart pattern screens. And when you scroll down, you get a lot of patterns from double and triple tops, double and triple bottoms, head and shoulders, inverse head and shoulders, triangle patterns. But unlike TradingView chart patterns indicators, here you get the variance of triangle patterns sorted under different sections, followed by rectangles and channels. But here also a few patterns are missing, like flags, pennants, wedges, broadening patterns, etc. But I think this is more than enough because I majorly focus on triangles, channels, rectangles, and sometimes head and shoulder patterns. So if you are someone who is interested in the patterns not mentioned in this screener, then you can skip to the next section of the video. But trust me, this scanner will make life easier for you. As you can see, each pattern has subsections based upon different trading periods like short term, medium term, and long term. And under each subsection, there are different time frames from 5 minutes to daily through monthly. Now, depending on your trading style, that is how long you intend to hold a position and what time frame you trade on, select an option that suits your requirement. So it may be a short-term trade on a 15 minutes time frame, or a medium-term trade on a 2-hour time frame, or even a long-term trade on a daily or weekly time frame. So once you have fixed the duration and time frame, select it on the chart pattern you wish to scan for. And once you click on it, you will get a list of stocks that satisfies the criteria. But in the free version, you will only get a maximum of 3 results. And if you want more results, you need to purchase the premium plan, which cost around 2000 rupees for an year. But I suggest you use the free version for a while and see if you really need it. Now let's get back to the discussion. Once the result comes up, we get to see all the necessary details regarding the pattern, namely the prices at which the pattern formation took place. This is particularly useful because it helps you check for the pattern in the charts quite easily, as you already know the price points to look for. But there is already a built-in chart feature in the screener. You can find this to the extreme right on the table. Once you click on the icon, it will take you to the chart, which is by default a line chart which shows the pattern's necessary price point with orange stars, which makes it easier to spot. You can change the charts to Candlestick by simply selecting from the drop-down menu on top. You even get the option to change the time frames and also the periods under consideration. You can also find some useful indicators like volumes, moving averages, RSI, Fibonacci, etc., which you can make use of. Or else you can always go back to your preferred charting tool like TradingView, which is much more powerful and easier to operate on. So this is how you can use this scanner for spotting potential chart patterns. You can check all other pattern screens in the same manner. Also keep in mind that this scanner will only scan for ongoing patterns and it will not show any data of previous patterns formed, which is necessary for backtesting. Now the drawback that I found out was that top stock research is not flexible enough to sort which category of stocks to consider. For example, I can't just run a scan on only Nifty 50 or Nifty 100 stocks. Due to this, the scan result can sometimes come out to be penny stocks or small gaps, which is very risky and illiquid. Also, it lacks some good patterns, but it is somewhat compensated by the pattern breakout scans, which give result of those patterns which have just broken out of the consolidation range. Okay, now let's get on to the final method, which revolves around screeners itself, but here you have more control. I'm talking about charting and Zerodha streak. Both these are powerful screeners which are easy to use as there is no need to learn any custom codes, but you still need to input the logic that you want to run on the chart. But this process is quite easy and user friendly. Let me talk about charting first. One advantage with charting is that it has been around for a while, so most of the chart pattern screens are already available. So all you have to do is to search for the particular chart pattern that you want to scan on the chart. Now how should you do this? I will explain. In the top of the home page of charting, you will find a screener menu. Just click on that option. Now a lot of scans just show up, from fundamental scans to top cloud to candlestick pattern scans, but the one we are looking for are chart pattern scans. But we won't find any in this section. So what you can do is that you can search for the required scan. Let's say I want to scan for a descending triangle pattern. Just type it and hit search. A large number of scans show up. Now which one to select? Usually the ones shown at the start of the results are the most loved scans. So always try to stick with the first top 10 scans. For now, let me just click on the first result and it will take me to another page where I can see the logic written in simple and understandable manner. Now, if you notice, the first line says, stock passes all of the below filters in cash segment. Now, this is where you can filter out stocks based on your requirement. All you have to do is to click on the word before segment, which in this case is cash, and you will see a drop-down list of all the available segments that you can choose from. So, if you want only those stocks from future segment or only from Nifty 100 or Nifty 500, just select it and move down the cursor to the Run Scan button and click on it. A new scan will run and it will give us the required shortlisted stocks under the segment that we have considered. You can analyze every chart by clicking on the stock name, but I'm not really a big fan of charting tool, so I would rather do my analysis on TradingView or my trading terminal. Now, if you have noticed, the charting free version data is delayed by some 15 minutes. So for intraday chart pattern trading opportunities, using the free version of charting won't really work out because the signals come late. But if you're someone who is into swing trading or someone who uses end of the day data, then this is not a big deal if the data is delayed. Also, other features like alerts are only available on the premium version, where you can set a lot of alerts for the setup you're looking for. But I don't feel like you should pay money for premium version because first of all the charting is poor and you have to run the scans manually for new stocks and you can't do an automated trading and so on. Now that brings us to our next screener come strategy duster come algo trading site by Streak, which is a part of the Zerodha ecosystem. You need to have an account with any of the following brokers. I already have an account with Zerodha, so I will log in with Zerodha. And once you log in, you will be welcomed with a neat homepage where you can see a discover section with the well-performing strategies. But for now, we are only interested in scanners. So on the top, click on the option that says scanners and a drop-down appears. Just click on the discover option and it will take us to a new page. And as you scroll down, you will be able to see a lot of custom scans. Now we will have to look for chart pattern scans. For that, click on the search scanner box on the left side. Then you can search for the pattern that you like. But the problem with Streak is that there aren't much chart pattern scans available. A few of those already available scans includes triangle patterns, double tops, double bottoms, triple bottoms, rectangle patterns, and that is very much it. So the only way to get other patterns is to make them by your own. You can do this by going to create new on the right side panel, or you can even find this on the top scanners drop down, which goes by the name create scanners. Just click on any of them and you will be taken to a new scanner creation page. It gives you the option to select the segment of stocks that you want to run the scan on. Now the interesting thing is that you can even scan options contracts of different expiries. Now the next option is to select the time frame that you want to run the scan for. You get time frames from 1 minute to 1 day. The next option is to choose the chart type. You can select between candlesticks and Hikenashi. Then there is a conditions section where we will enter the required conditions for the pattern. So what I recommend is that you go to charting, search for the pattern you wish to trade, then select the most loved scan of that particular pattern, copy or screenshot the code logic, and then come back to Streak and fill the conditions into the conditions section. And once you're done, give it a name and run the scan. Right now, I don't have a premium plan for Streak, so I can't run a scan. But if you have a regular or ultimate plan, you can run a large number of scans every day, and you can even do a lot more than that. You can backtest most of your trading strategies, analyze them, and even trade these strategies virtually using paper trading, or you can do real-time trading using your broker. I think it is a value for money, so you can check it out. But this is not a recommendation or promotion. I'm talking based on my experience because I have used this for backtesting my strategies and paper trading automatically before I trade with real money. So I think that is all the 3 methods that I wanted to share. All of them have their own pros and cons. So try all of them and choose the one that works well for you.
Supply and demand is one of the most popular trading systems among traders. It can be regarded as one of the most profitable strategies that one can use to trade the market if done right. As you all know, the stock market is where traders buy and sell assets. The movement of the prices is due to supply and demand forces. Now, once you understand the dynamics of these two forces, namely supply and demand, you will be able to anticipate almost every price movement on any price chart. You will be able to track the smart money without doing extensive quantitative analysis and crunching all those data in your Excel. This video aims to give you all the necessary tools you'll need to master supply and demand in the market. This topic will have 2 video parts. In this video, you will learn the core ideas on how to identify, draw, and trade market imbalances like professional traders. And in the upcoming video, we will learn how to filter supply and demand zones using odd enhancers, which will help you eliminate low probability zones and keep only those with high odds of success. Now, the objective of this video is to help you implement this particular trading concept correctly so that you can become profitable in the long run. Now, the video will cover the following topics. We will start with what exactly is supply and demand.
and we will understand what a market balance and imbalance is. Then we will talk about how to identify supply and demand zones in the chart, and what are the different structures of supply and demand zones that you will see in the chart. Then we will learn how to draw the supply and demand zones and how to trade these zones. And finally, we will identify the supply and demand curves and also learn about why it is important to identify the curve in the first place. So without wasting any time, let's jump right on it. So what exactly is supply and demand? The supply and demand concept states that if the supply of a stock or a commodity is high and its demand is low, this will generate excess supply which will drive the prices down. And if the supply of a stock or a commodity is low and the associated demand is high, then this will create a scarcity in the supply which will push the prices even higher. For example, during times of uncertainty and fear, similar to one with Ukraine-Russia war, the investors will reduce their exposure in the equity markets and start buying safe haven currencies, or they turn to low-risk investment options like gold, government bonds, etc. to protect their investment. So in such a situation, the demand for these asset classes like gold and safe haven currencies will drive their prices even higher. Another example is when the Fed or the Federal Reserve decides to increase the interest rates. What it does is that it will make the US dollar more attractive to the investors because of the increased interest yield. This is also known as a carry trade, where traders buy the currencies with high interest rates and sell those currencies with low interest rates. We have seen this recently when Indian rupee traded against USD at an all-time high. Now, having understood the supply and demand concept, we need to define supply and demand zones and understand how prices moves on the chart. Basically, a supply zone is located above the current price where there is a strong selling interest. At a supply zone, sellers exceeds buyers and price moves down as unfilled orders get absorbed. So when price reaches this level or zone, the orders get filled and the prices starts to move down. And traders are usually selling at these supply zones. And as you can see on the chart, the price rallies to a certain level or a zone, then it pauses for a little time and then retraces back down. So as long as unfilled orders are sitting in this zone, prices will keep coming back to this supply zone until all these orders are filled. Now talking about a demand zone is a price area below the current market price where there is a strong buying interest. And at the demand zone, the buyers exceeds the sellers and the prices goes up as unfilled orders get absorbed. So we can see a lot of buying interest in the demand zone. This is most likely caused by a large number of buying orders at that level. And the traders are buying at demand zones. Most often when the price reaches the demand zone, some of these orders get executed, and what you will see in the chart is a sharp move towards the upside as these orders get filled. Now when it comes to trading the market, many traders rely heavily on technical indicators and market sentiment to spot the shift in momentum, while there are other traders who simply trade the market imbalances by searching for supply and demand zones. Now this term is very important, imbalance. I will talk about it in a short while. Now these zones that I have discussed are actually price levels created by banks and institutions where unfilled orders are waiting to get filled. Now the whole concept of supply and demand is centered around finding the smart money orders on a price chart. It is simply because they have the power to move the prices and they are the ones you should trade with. The basic pattern associated with stock market is balance, imbalance, balance, imbalance, etc. And the market trades between an established excessive level until it trades above the high of the excess, that is a breakout above the resistance level, or it trades below the low of the excess, that is a breakdown below the support level. Now it may seem confusing, but we will clear it out as we move further in this video. So talking about a balance area, if the market is balanced, it means that there are equal amounts of buying and selling activities and the prices keep moving up and down within a particular sideways range. Now when it comes to an imbalance area, it is when the buyers or sellers are in control and the market is imbalanced and it will move in the direction of the predominant players. So if the sellers are in control, the market will move down, and if the buyers are in control, the market will move up. Now to understand this concept of balance and imbalance, let's move to the chart and see how we can apply these key points.
As you can notice in the chart, the blue colored boxes show balanced areas, and these areas are areas where both buying and selling activities occur at the same time, or simply the supply is equal to the demand because both the buyers and sellers are comfortable around this particular price range. And you can notice the price move horizontally or in a sideways range. Now, once the market moves from a balanced state to an imbalanced state, the price leaves the area with large candles. And this represents an imbalance, which means that one of the players, either the buyers or the sellers, exceeds or dominates the other. So on the chart, we can see that the sellers exceeds the buyers and the prices drop with a very quick momentum and with strong candles. Once again, the market enters a balanced state, waiting for the price to take a directional move to either the upside or the downside area. And this cycle will continue over time. So in general, the cycle of the market is associated with balance, imbalance, etc. So, in a supply and demand strategy, we will be focusing on spotting these areas of balance. The reason being, we want to place our buy or sell orders in these areas and we want to profit from the imbalance that will move the price in a directional point of view. But in order for you to trade the market imbalances, you first need to identify the supply and demand zones correctly. And to do that, there are a set of rules that you have to follow that will help you find these zones on any assets that you want to trade. But before that, let me talk about the different patterns associated with this strategy that we need to be aware of. Actually, there are two types of structures or patterns that we need to learn. The first type is reversal patterns and the second type is continuation patterns. So when it comes to reversal patterns, as you may already know, reversal patterns are chart patterns that are formed when the trend reverses its direction, that is from an up to down or a down to up trend. Now when it comes to reversal patterns, we have two structures. The first one is a drop base rally structure. In this structure, the price is moving in a downtrend, creating a drop in price, which is followed by a base structure and then a rally in the price towards the upside. The second structure associated with the reversal pattern is the rally base drop structure. So in this structure, the price rallies up and it creates a base structure and it is followed by a big drop in price towards the downside. Actually, these reversal patterns are very strong and the price tends to respect them over time. The second category includes continuation patterns, which actually signals a trend continuation. Here also, two price structures are formed. The first type is the drop base drop structure. In this structure, the price drops and then it forms a base structure and then it continues moving down, breaking through the base. And the second structure is a rally base rally. Here, the price rallies up at first and then it forms a base structure which will then continue moving up, forming another rally. Now, these continuation patterns are found inside the trend. And most of the time when the price tests these structures, the price tends to break through them. And that is why we will focus only on reversal patterns because they have good odds of success compared to the continuation patterns. Now with that information, let us move on to identifying the supply and demand zones on the chart following a simple 3-step process. The first step is to identify the current market price level. So this is the easiest step. All we have to do is to start off by identifying the current market price. The second step is to look to the left from the current market price to find extended range candles in the last drop or rally. So in this step, we need to find ERC type of candles. So ERC stands for extended range candles and it is actually a candle that has a very large body with little or no wicks. So if the body's length is equal to the length of the wicks, it is not actually an ERC candle. And then we have to find the origin of the move. So once we have identified an ERC type of candle, we have either a drop or a rally in price. Now we have to find the origin of that move. The origin will actually form the base of our supply or demand zone. And the base is what we require to draw the zones, as we will see later on this video. Now let us look at an example of the entire identification process. So in this example, we will start at the current price and we will look to the left to find a drop or a rally in price with at least one ERC type of candle. And once we identified an extended range candle, we will have to identify the origin of the move. The origin is actually what we call the base. Now that we know how to identify the supply and demand zones, we need to learn how to draw our supply and demand zones. But before that,
Since the market these days is highly volatile and on most days we see the market gaps up or down in the morning, it is important to include gaps in our training. Market gaps are extremely useful price action structures that enables us to identify the supply and demand zones. So they can act as if they are indicators of the market imbalances, as they indicate clearly where the market is going so that we can trade accordingly. So from my point of view, gaps are actually leading indicators for trading supply and demand imbalances. So I have made a video on how to trade gaps from a price action perspective in my free price action trading course. You can check that out to know in depth about market gaps. So a gentle reminder, a gap is an empty space between two candlesticks where the price either rises or falls from the previous candle's close with no trading occurring in between them. What this represents is a big supply and demand imbalance where either the supply exceeds the demand or the demand exceeds the supply. This is extremely important for us as it shows exactly where the market imbalance is located on a price chart. So for your information, a gap up is a gap that occurs when the lowest price of a candle is above the highest level of the previous candle. Similarly, a gap down develops when the highest price of a candle is below the lowest price of the previous candle. Now when we talk about gap fill, a gap is considered to be closed or filled when the price comes back and fills the entire range of the gap. And once the price fills the gap, it generally reverts to the direction of the prevailing market trend. Now, based on the types of gaps, we can anticipate either the beginning of a new trend or a reversal of a previous trend. So in supply and demand, there are actually two types of gaps that are important to us. Number one is the professional gap and number two are the novice gaps. Now talking about the professional gap, it is a gap that occurs in the opposite direction of the prevailing trend. Take a look at this example. We have a professional gap that is formed in the opposite direction of the prevailing trend and the price retraces back to fill the professional gap and we can see the price reverses up from there. Now this kind of gap signals a market imbalance is created by professional traders and it gives us a great demand zone to trade once the price returns to fill the gap. Now the second category of gaps are novice gap. It is a gap that occurs in the direction of the prevailing trend itself. So a novice gap tends to form at the end of the trend, which will in turn lead to a reversal of the trend. For example, in this chart, it shows how the novice gaps are formed on the chart. You can see the price rallied, creating a gap in the same direction of the prevailing trend, but then suddenly it reversed back down. And as we have mentioned, novice gaps are located at the end of the move, and in the chart we can clearly see that the move ended and the price moved in the opposite direction. We can also notice that there is a zone where the reversal actually started. Now it is very important to understand these two types of gaps when trading supply and demand because they give us important piece of information as to where the market is willing to go next. And finally, we will now learn how to draw the supply and demand lines on the chart. In order to draw the supply and demand zones, we use two lines that we place around the base of the zones. The first line is called as a distal line and the second line is called as a proximal line. As I have mentioned, both these lines are placed around the base to form our supply and demand zones. The distal line is the outer line of the zone which is placed away from the current price and the proximal line is the inner line of the zone which is placed near the current price. Now let me talk about a few things that you should keep in mind when drawing the supply and demand zones. The first and foremost thing is that you should have an idea about the structure of the base. The base must actually have less than 6 candles and the candle's body should be less than or equal to 50% of the candle's total range. And the price leaving the base should have at least 2 extended range candles. And the base should not have the following things. That is, it should not have more than 6 candles. It should not only have doji candles. And we won't accept candles with very long tails or wicks. And we don't accept stair-step candles in our base. So there are reasons for this. For example, if the base has more than 6 candles or only has doji candles, we ignore it. The reason being more than 6 candles and only doji candles can simply mean that the supply is equal to the demand and most of the orders are getting filled. Now having less than 6 candles and not a lot of doji candles shows a great imbalance and more unfilled orders are still waiting for the price to retrace back and fill them. So the zone will remain valid for them. Now what will happen if the base has candles with very long tails or wicks? It simply means that the level is a reaction to the previous supply or demand zone.
Now these tails shows that the market participants went all the way down to look for unfilled orders, and they kept going back and forth until they got enough strength to push the prices higher. So most of the liquidity in that area would have already been absorbed. Also, a base structure that has a stair-step candles is actually a low probability zone. What I mean by a stair-stepping structure is that one candle is closing below the close of the previous candle in case of a supply zone, and one candle is closing above the close of the previous candle in case of a demand zone. Now when it comes to drawing supply and demand zones, there are a lot of different options to choose from depending upon a person's risk appetite. In general, there are 3 methods of drawing your proximal and distal lines based on your risk appetite and how conservative are you in your trading. I will show you all the 3 methods that you can use to draw the supply and demand zones properly, and you can choose the right method that better suits your trading according to your risk tolerance. We have already discussed that supply zones can either have a rally-based drop or a drop-based drop structure. To correctly identify a supply zone, we have to start and leave from the current market price to find strong bearish candles with large bodies or bearish ERCs. In this chart, we can see the price rallied up in a nice uptrend and it paused for a short time, creating a nice base structure with a few candles. Then the price dropped, creating long bearish ERC candles, conforming to a strong market imbalance around this supply zone. And once you identify the zones you want to trade, you can now draw your lines around the base or the origin of the move. Now, as I have mentioned, there are 3 ways of drawing your supply zone. The first is the conservative method, where the distal line is placed at the highest wick of the base and the proximal line is at the lowest of the body in the basing structure. The second method is the high risk method, where the distal line is placed at the highest wick of the base and the proximal line is placed at the lowest wick of the basing structure. Now, if you decide to include both the high and low of the wick, you have in turn increased your risk by making your stop losses larger than it should be. Now the third method is the low risk method, where the distal line is placed at the highest wick of the base and proximal line is drawn at the highest body in the basing structure. So in a similar manner, you can draw the lines on a drop-based drop structure, but frankly speaking, I'm not a great fan of it, so I leave it up to you for the study. Now, as the price keep retracing back to the supply zone, we can take advantage of these retracements to place our trades around the base area. You will notice how the price retraces up and drops as soon as it approaches the supply zone without even piercing the proximal line. This means that large piles of unfilled orders are placed around the supply zone. Now, the idea is to place your orders and wait for the price to return and trigger them. Now, in order to identify a demand zone, we need to start from the current market price and move to the left to find a nice rally in the price or a group of bullish ERC candles and also a base with less than 6 candles. Now we are going to do the same thing as we did for supply zones, but in the opposite manner. We will start by identifying the basic structure to draw our zone. Then we draw the proximal line and the distal line using the 3 methods of drawing. In the conservative method, the distal line is placed at the lowest of the wick of the base and the proximal line is placed at the highest body in the basing structure. In the high risk method, the distal line is placed at the lowest wick of the base, while the proximal line is placed at the highest wick of the basing structure. And finally, in the low risk method, the distal line as usual is placed at the lowest wick of the base, while the proximal line is placed at the lowest body in the basing structure. Now, as the price keeps retracing back up to this demand zone, we can take advantage of these retracements to place our trades around the base area. And you will notice how the price retraces down and rallies as soon as it approaches the demand zone without even piercing the proximal line. This means that a large piles of unfilled orders are placed around this demand zone. And the idea is to place your orders and wait for the price to return to trigger them. And if you decide to include only the highest wicks for supply zone and only the lowest wicks for the demand zone, you are decreasing your odds of getting your orders filled by the market price. Now that is why we include a second line, which largely improves our odds of entering into the position as well as keeping an eye on the risk factor also. Again, when drawing supply and demand zones, you have to keep in mind both your risk exposure and your odds of making money. Now when I talk about gaps are actually strong price action structures. So when it comes to drawing supply and demand zones that have gaps, it is important to know where we need to place our distal and proximal line.
Now, as a rule of thumb, we always draw our zones at the origin of the gap and not after it. That is, we place the distal and proximal lines at the highs and lows of the previous day's closing prices accordingly. Now we come to the most important part. How do we trade supply and demand zones? We buy at the demand zones and we sell at the supply zones. This strategy is pretty straightforward. All you have to do is to identify fresh supply and demand zones to trade. Then place your limit orders, either buy or sell orders, at or beyond the proximal line and set your stop losses at or beyond the distal line. And then wait for the price to return to your supply or demand zone to trigger your orders. Now take a look at this chart. For the supply zone, the price rallied up, paused for a little while and dropped with big ERC candles. So we have a great imbalance at this price level. We draw our supply zone and we wait for the price to come back and retest this zone, and we also place our order. When the price comes back the second time into the zone, our sell order gets executed, and as you can see, it will be a great success. Now take a look at another example where the price dropped, then paused for a while and rallied again with big ERC candles, thereby creating a demand zone on its way up. Now we place our buy orders in the proximal line, expecting the price to return back to the demand zone to absorb the unfilled orders. Now each time the price tested our demand zone, it triggers our buy orders. We can see how the price is attracted to the zone like a magnet. Now there are times when you're not sure if the zone will yield a successful trade. So what you can do is to wait for the price to test the zone and give you some bullish or bearish evidence before placing your order. By that way, you could decrease your chances of entering a losing trade. Again, I prefer reversal structures for trading because they are powerful and the chances of success are high compared to the continuation trend structures. We will talk about the supply and demand curves, how to identify supply and demand curves, and how to trade profitably using the curve. So I need at least 500 likes on this video because it takes a lot of time and effort to provide quality content free of charge. And if you are new to the channel, make sure to subscribe and enable the bell notification so that you won't miss out on any upcoming videos. Okay then, let's get started. Supply and demand are the two dynamic forces that establish market prices. These forces are driving prices up or down based on who's in control over the market. For instance, if supply exceeds the demand, prices tends to go down as more sellers are interested in selling instead of buying the asset. On the contrary, if the demand exceeds the supply, prices tend to go up as more buyers are interested in buying instead of selling the asset or stock. So the curve is basically a tool that traders can use to determine whether the price is located near a higher time frame supply or demand zone. Now this is very important as we want to buy low and sell high in order to make a profit. Now you may ask me why I should take the trouble of drawing the curve when I can just trade using the zones and odd enhancers to get a high probability trading setup. As I have mentioned just now, the reason why we determine the curve is to avoid buying high and selling low, or in other words, to avoid buying at the supply zone or selling at a demand zone. Now this step is very crucial in trading the markets using supply and demand because our goal is to trade with the trend and not against it. So let's start off by identifying the supply and demand zones first. To identify the supply and demand zones, we will use yet another simple 3-step process. First, we will use a larger time frame to draw our zones in control and then determine the location of the current market price on the curve. So the first step is to choose your higher time frame. As you may know by now that multiple time frame analysis or multi-time frame analysis is a method of analyzing at least 2 or 3 different time frames of a particular stock or an instrument to construct a bigger picture of the long-term trend. Now the whole idea is to trade with the trend, and the multi-time frame analysis allows us to align our trades with the higher time frame trend. Now always remember that the larger the time frame, the better the chances of a successful trade. I have already made a video on the selection of time frames and multiple time frame analysis, so if you want you can check that out. Now in that video, I stated a rule on how to select time frames based on trading styles. The rule says that when you choose your time frame combination, the higher time frame needs to be at least 3 to 6 times greater than your intermediate time frame and so on. For example, if you want to take a swing trade, your higher time frame would be a weekly chart. The intermediate time frame would be a daily chart, because there are 5 days in a trading week, and when considering a factor of 5, the time frame becomes 1 day. The even lower time frame would be the 1 hour chart. However, in this video we are going to take a positional trading approach, and we are going to use the monthly chart as our higher time frame. The weekly chart will be our intermediate time frame, and finally the daily chart will be our lower time frame. Now you can use any combination of time frames based on the type of trading style that you follow. The second step, however, is to identify the supply and demand zones under control. Now, the idea of the second step is to determine who's in control of the market. Is it the buyers or the sellers? Now, after we open the monthly chart, we have to start by locating the current market price. Then we need to identify the closest supply and demand zones to the current market price. In this chart, we can clearly see that the price is near the higher time frame demand zone. Now take a look at another chart where the current price is located almost in the middle of the supply and demand zone under control. The reason why we look for the location of the price with respect to the zones is that we can still take a trade entry as long as the longer time frame gives us a good profit margin to make money. Otherwise, we don't generally look to take a trade in the middle of the zone, and one of the reasons being the difficulty in the placement of a proper stop loss. Now moving on the third and final step, drawing the curve. So the third step is to divide the area between the proximal lines of the supply and demand zones under control into 3 equal areas. Now the idea is that after identifying the closest supply and demand zones, you have to divide the distance between them by 3, and we will get a high area, a low area, and an equilibrium area. There are 2 methods to divide the curve area. The first option is simply to count how many points there are between the 2 proximal lines of the zones which are under control and divide them by 3. Now the second option is to use a Fibonacci retracement tool to identify the supply and demand curves without having to divide the area manually. To draw the curve areas using the Fibonacci tool, you have to modify the settings to get exactly 3 equal areas on the chart. So all you have to do is to change the Fibonacci levels to the following, that is 0%, 33%, 66% and 100%, and you can uncheck all other levels. Now that you have changed the Fibonacci settings, you can draw the curve from the proximal line of the supply zone to the proximal line of the demand zone. The Fibonacci tool will divide the area into 3 equal zones automatically. I hope things are clear. Now you may ask me, why is it important to identify the curve in the first place? Now this is actually what separates the winners from losers in the big game. The professional traders know that when the price is high on the curve, they need to sell to the retail traders who are actually excited to see an uptrend move continue. So the retail traders jump onto the trade and start placing buy orders. And professional traders actually use this high liquidity provided by the retail traders to actually short the market and move the prices even lower. Now similarly, when the retail traders see the prices dropping very rapidly, they think this is a great chance to short the market. Once again, the professional traders jump onto the opportunity to place their buy orders as the price enters new low territories on the curve, signaling a nice bullish reversal to the upside. This is why it is important to identify the curve before placing any order. Now let's move to the most important section, that is how to trade using these curves. So on the larger time frame that we have analyzed, the curve serves as an indicator as to whether the price is high, low or in the middle with respect to the supply and demand zones in control. Now based on this information, we can decide whether to buy, sell or do nothing. Now there can be different trading scenarios based on the curve. When the price is very high in the curve, usually inside the supply zone, our trading bias is to sell only. Now if the price is high in the curve, that is just below the supply zone but higher than the equilibrium zone, we will still look to sell only. On the opposite, when the price is very low in the curve, typically inside the demand zone, we will look to buy only. And as you may have already guessed, when the price is low in the curve, that is just above the demand zone but lower than the equilibrium area, we will still look to buy. Now what happens when the price is at the equilibrium area? Then we will have 2 options, that is either to trade with the prevailing trend or do not trade at all. Now it actually depends on how aggressive you are with your trading style. Now let's put everything together and see how we can identify the supply and demand curves and plan our trade accordingly. So the first thing we do is to begin with the larger time frame to determine the location of the current market price within the supply and demand zones in the control. this will actually give us the framework to look for trading opportunities. Once we have identified the supply and demand zones in control, you can use the Fibonacci tool to divide the area into 3 equal levels or zones as shown in the monthly chart. So as a general rule of thumb, we buy when the price is low on curve and at the demand zone, and we sell when the price is high on the curve and at the supply zone. So when the price is at an equilibrium, we either trade with the prevailing trend or we don't trade at all. Now in the chart, the current market price is located between the low and the equilibrium areas of the curve, which means that our bias is only to buy as long as the trend is up. But when we zoom in on the weekly chart, we can observe how the price broke the trend line and created a new supply zone. The price then moved down and created a new demand zone, which is actually nested inside the monthly demand zone. So what we have on the monthly chart is that the price is at the low or the equilibrium area in the curve and the overall market is uptrending. But on the weekly chart, the price is moving sideways with a weekly demand zone nested inside a monthly demand zone. So if you think of selling when the price tests the weekly supply zone, then you are actually trading against the higher time frame trend, which is not our objective. So as we said in the beginning, the higher time frame always prevails. Hence, we should avoid selling from the weekly supply zone because the trend is uptrending, and on top of that, the reward to risk is not satisfactory. Instead, the ideal thing to do is to wait until the prices hit the monthly or the weekly demand zone and then look to go long. At this level, the buyers will be interested in buying more and hence pushing the prices higher. And as we can clearly see, the prices went back down to the weekly or monthly demand zone and then rallied to the monthly supply zone, which actually provided a low risk, high reward trade. So as long as we trade with the long term trend, we are safe. Now let's take a look at another example. On the monthly chart, the current market price is high on the curve. This means that our bias is only to sell from the fresh supply zones on lower time frames. Now zooming in on a weekly chart, we can observe that the price is moving up and creating new higher highs and new higher lows. We can also draw a trend line connecting the two higher lows together, which indicates that the trend is towards the upside. On the same weekly time frame chart, we will draw our supply and demand zones to align with our views with the monthly chart, which is the higher time frame here. So when we do that, we get a weekly supply zone which is nested inside the monthly supply zone. This means that this weekly supply zone will have a higher probability of success because it overlaps with a higher time frame zone. Now the same thing applies to the demand zone down at the bottom of the chart. Now these nested or overlapping zones have a higher probability of success because the higher time frame zones are more powerful than the lower ones. Now that we know the price is high in the curve and the trend is up, we need to find a supply zone to place our entry and stop loss accordingly. So we don't just buy in the demand zone because the price is high in the curve. Also, we have to notice that the price is near the monthly supply zone, which means that soon the price will reverse down and pierce all the demand zones that are up in the curve. So in order to buy, we can either use the weekly chart or use an even lower time frame like the daily to find a suitable entry zone. So if the weekly zone is obvious, as in this example, we can just stop our analysis here and place our entry right at the proximal line of the weekly supply zone. But if the weekly supply zone gives us a larger stop loss that we cannot handle, or if the zone is not giving us a clear entry point, then moving down to a lower time frame is the ideal thing to do. So on the lower time frame chart, we have a nested daily supply zone within the weekly supply zone. Now this has become a high probability zone to trade in. We can place our entry at the proximal line and place our stop loss above the distal line. To exit the trade, we can place our target at the opposite demand zone. The profit margin is good as we have at least a 3:1 reward to risk ratio in this particular trade. And as you can see, the price hit our entry level at the proximal line and dropped all the way down to our target, giving us a very good trade. From this particular example, you can also notice how the risk changes from monthly to daily supply zones. So if we were to trade the monthly zone, we would have placed a larger stop loss and the price would almost pierce half of the zone before reversing back down compared to the weekly and daily supply zones. So it is always a great idea to use multiple time frames and trade on a particular time frame that gives you the best trading setup. You can use any set of time frame as you wish. So if you are an intraday trader, you can use a combination of daily, hourly and 15-minute charts to conduct the analysis and find the zones in control, draw the curve and identify if there is a trade opportunity in the direction of the existing market trend.
In the first part of the video series, we discussed the supply and demand zones in greater detail, from identifying, drawing, and trading these zones. In this video, we will fine-tune all what we have learned to make a proper setup with a higher probability of success and a better risk management. In that sense, we will talk about the odd enhancements and the scoring of these supply and demand levels. So in order to trade the market with supply and demand strategy, you must use some essential odd enhancers to help you select only those zones that have a higher probability of success. Remember that not all supply and demand zones work. You can't just buy every demand zone and sell every supply zone. For that, you need to learn how to filter them properly using odd enhancers to evaluate your zones. So basically there are 21 odd enhancers that have to be considered, but all of them are not important to make a note of. But I will still post a link in the description of this video if you want to learn more about it. In this video, however, I will talk about 5 important odd enhancers that you can make use of. This will definitely increase your odds of success and minimize your potential losses in the market. If you have been trading the markets using supply and demand for a while, or you have just started with it, you have probably found yourself stuck not knowing which zone to choose, especially if you have at least 2 zones which are very close to each other and you know that it's either this one or that one. But which one to choose, and based on what criteria you make your decision to stick to one. Often this will lead you to enter a trade earlier than you should, or you might even place an order in a zone that the price won't visit at all. This can really be frustrating because sometimes you have to wait for a longer period of time for the price to return to your zone and trigger your orders. By choosing the wrong supply and demand zones, you are leaving some of the good trades on the table. So, how can you filter out these supply and demand zones you have identified so that you only pick those which presents a high probability of success? Remember, the goal is always to stack the odds in your favor and not the other way around. The solution is to have a scoring system or a filtering system. Now, the scoring system is based on analyzing 4 or 5 major odd enhancers that I will discuss and to give a final score to each one of them so that it all adds up on a scale of 1 to 10 in total. And this system will help you score the supply and demand zones to let you decide which ones to trade. Okay, now let us visit each of the 5 odd enhancers one by one and set a criteria for scoring on each one. The first and foremost odd enhancer is the strength of price move from the base. Now the first thing to look at is the strength of the move out of the origin or the basing structure. In other words, we look at how the price leaves the supply or demand zone. Was it actually a strong move or a weak move? A strong move is one that is comprised of big candles and sometimes even gaps are formed as the price leaves the zone. On the contrary, a weak move has many small candles and the drop or the rally doesn't go far from the zone itself, or simply the price action is weak. In this chart, you can see that the price left the supply zone with strong bearish candles to the downside, making them very strong zones to trade. You will also notice how the price did not go all the way up to test the supply zones to move down in a strong manner. This shows how great an imbalance is at the supply zone. Now let us take a look at an example where the move out of the base is weak. This demand zone is considered weak because the price left the zone with very small candles. The move out of the demand zone is actually weak, and as a trader you should avoid trading such weak zones because the price will ignore it and most probably the price will pass through it the next time it tests it. In short, if the price leaves the zone with long candles, this means that the imbalance is strong and more unfilled orders are still available at the zone. But if the move from the zone is weakly represented by small candles, this means that probably no more unfilled orders are still there for us to trade. Now based on this first odd enhancer, we can give a score from 0 to a maximum of 2 points. So when we have a supply zone where the price leaves the zone with big candles, this zone shows a high probability of success because of the strength of the price move out of the basing structure. Now the score we will give to this zone is actually 2 points, which is the maximum score, and you will notice how the price drops when it returns to test the zone again.
Now when it comes to a weak supply zone, where the price left the supply zone with weak and small candles, what this means is that there are no more unfilled orders that are left to be traded, and the sellers are losing interest in selling at this price level. Soon they will be outnumbered by the buyers, who will take the control of the market and move the prices beyond the supply zone. So this zone will attract a score of 0 based on our first criteria. Now the same is applicable to the demand zones also. Now coming to our second odd enhancer, that is the time spent at the base. Here we will look at how many candles are in the basing structure. In general, the best zones have between 1 to a maximum of 6 candles in the base. Now beyond 6 candles, the zone is considered weak, and the price might ignore it the next time, and therefore it can result in a losing trade. So this clearly means that if the imbalance is important enough to generate a directional move, the price has to spend less time at the basing structure. That is why we should limit the number of candles between 1 to a maximum of 6 at the base. Now take a look at this chart. We have a rally base drop structure, but with only one basing candle at the supply zone. This is a very strong basing structure. So we will give a maximum score of 2 for this supply zone. While in case of this demand zone, the price spent a little more time and created a few more candles at the basing structure. So we can give a score of 1 to this demand zone. Now another thing to consider while analyzing your basing candles is the tails of the wicks. Now basing candles with long wicks or tails are a sign of a weak zone. So in this example, the price spent too much time at the base creating more than 6 candles. This is a weak zone because the price did react but failed to move higher, and finally it went through the zone to look for another demand imbalance. Now the score for this demand zone is therefore 0. Now let us move on to the third odd enhancer, that are fresh zones. Now a fresh zone is a supply or demand zone that the price has not tested yet. The first retracement tends to be the strongest and the most reliable one to trade. So as a trader, you should always choose fresh, untested zones to stack the odds in your favor. After a second retracement to the zone, it is better not to consider it because there might not be enough supply or demand to move the prices, as most of the orders might be absorbed during the 2 initial retracements. Now look at this chart. We have a supply zone that the price has not tested yet. These are actually good zones to short once the price retraces back to this zone. Now the same thing goes for a fresh demand zone. If the price returns to test it, we look to go long. In the first retracement, the price tested the supply zone and moved down. The same thing happened in the second and the third retracements. But after the third retracement, the price broke above the supply zone, which indicates that no more supply was found there. Similarly, you can notice how the price left the supply zone after the second and third retracement. The strength of the last 2 moves are weakening, which in turn signals a potential shift in the market imbalance as more buyers are stepping in, thereby creating a breakout above this supply zone. Now consider another example where the price broke the demand zone after the second retracement. You can notice how the price penetrates deeper inside the demand zone with each retracement. This is a very good signal that the supply zone is no more valid and a potential breakthrough is expected. Now after the second retracement, the demand zone is no longer valid as the market imbalance shifted from demand to supply. Now in terms of scoring a fresh zone that has not been tested, you can give a score of maximum 3 points. This is the one we need to focus on when trading supply and demand zones in the market. We need to stack the odds in our favor by choosing fresh, untested zones to trade. Now, if the price retraces back to our zone for a second time, we can give it a score of 1.5 points. Now, we can still consider this zone, but again, we will always be looking for high probability trading setups. Now, if the price retraces back again for a third time, we will give it a score of 0 as it has less probability of success. At this point, most of the unfilled orders are already gone and the price might pierce the zone and move away to find another supply or demand zone. The fourth odd enhancer is reward to risk ratio. The reward to risk ratio, as you may already know, gives us a good idea of whether we have a chance of making money trading on a particular supply or demand zone or not. So we need to choose those trading opportunities that offer us at least a 3:1 reward to risk ratio. A ratio of 3:1 is a perfect ratio because we are risking 1 point to gain 3 times. For example, if a trade has a 10-point stop loss, then the target should be at least 30 points away from my entry point. So if the market does not give you a 3:1 ratio, then it is better to stay away from this trade and we will look for another opportunity which offers us a 3:1 reward to risk ratio. But you can also scale it down if you want. A 2:1 ratio is also a good ratio and the trades could work just fine. But again, we are always looking for high probability setups and we leave those with a low rate of success. And a 1:1 ratio or less is considered a non-valid entry since the market does not offer a good opportunity to make money. If the zone gives us at least a 3:1 ratio, we give a score of 3 points, which is the maximum score to this particular zone. Now, if the zone gives you a 1.5:1 or a 2:1 ratio, then we will give it a score of 1.5 points. And finally, if the zone gives us a ratio of 1:1 or less, then we will give it a 0 score because we will ignore the zone and we will wait for another opportunity. Now, the last and final odd enhancer that I will be talking about are the overlapping zones. These are also called as nested zones. Now, the idea here is to look for overlapping zones from different time frames. For example, if you have a supply zone on a daily time frame that is located inside a monthly supply zone, this daily supply zone is considered strong and it presents a high probability of success. So, as a thumb rule, higher time frame zones are much more powerful than smaller ones. So if your lower time frame zone is nested inside a higher time frame one, it is actually a strong zone. So here in this example, we have a daily zone indicated in blue that is nested inside a higher time frame monthly supply zone, which is represented in red. But how to find them and draw them? To find the nested zones, you start with the higher time frame. Now in this example, the higher time frame is monthly. So we draw the monthly supply zone, then we will move to the daily time frame to look for supply zones within the monthly zone that we have already marked. You can also have a daily demand zone nested inside a weekly demand zone and so on and so forth. I hope you get the basic idea. Now, I won't be including this odd enhancer in my scoring criteria because not all levels present such an opportunity and the chances of missing out will be higher if we make it a strict criteria to follow. Now that we have a scoring system in place to help us score the supply and demand zones, we need to interpret the final score to either execute the trade or wait for more confirmations. Now let us say a zone has a score of 10 points. So a final score of 10 points means that we can place a limit order at the supply or demand zone that we want to trade beforehand so that you will not change your mind for some reason. Now this order will get executed once the price reaches 10-pointer level, namely the proximal level of the zone. But make sure you place the stop loss order at or beyond the distal line to protect your position. Now this score of 10 shows that the zone is a strong zone, fresh with less than 6 candles at the base and giving us a good reward to risk ratio to make money. Now what if a zone has a score between 8 and 9 points? Now if the score is between 8 and 9 points, we can think about a confirmation order. Actually, a confirmation order is an order placed when the price first dips into the zone of interest and crosses above or below the proximal line of the supply or demand zone. So the idea is to confirm that the price is moving in our preferred direction of trade. So any one candle has to close inside the zone first and the second candle on its way out has to pierce the proximal line of our zone. Now the moment the price pierces the proximal line, we place a market order. Here we don't place a limit order because the odds are not completely in favor of us. The stop loss order setting is standard as always. And finally, what if we get a score of less than 8 points? Now, if the final score is below 8 points, it simply means that there is no trade. The supply or demand zone with a score below 8 points is actually a weak zone that has a low probability of success. So it is better you avoid taking the trade. As I have mentioned earlier, you can read more about other odd enhancers in the link provided in the description, and you can be flexible enough to change the criteria and scoring according to your convenience. Now with that being said, the odd enhancers we discussed here are very important tools to help you filter the supply and demand zones. In addition to that, the 4 odd enhancers used in this filtering system are what you need to score your supply and demand zones. This will further help to fine-tune your filtering system. But remember that these odd enhancers don't guarantee the success of your trade. Instead, what it does is that they give you a better chance of taking the right trades when they show up and leaving the ones that have a low probability of success. So it is up to you to do your research, learn more, backtest on multiple charts, and finally implement it in your trading to see if it really works for you.
So here I am, thrilled to present you with this new video course on smart money concept. The course is designed in an orderly manner to provide you with the most comprehensive understanding of the principles and strategies associated with smart money concepts. I'll be taking a very conventional approach, assuming that all of you are complete beginners to this topic. Keeping that in perspective, I will discuss the main concepts in greater detail, which is actually essential to build a solid foundation so that we can have a good understanding about the strategies that we can implement as a trader. This will in turn enable us to plan our proper entries, stop loss, and targets, thereby generating high reward to risk trades, which is the highlight of this entire SMC concept. I'm not even joking when I say high reward to risk ratio. We are literally talking about 10:1 or 20:1 or sometimes even a whopping 40:1 reward to risk ratio, which is absolutely insane. And that tells you how powerful these concepts are. By now, I have mentioned smart money concepts numerous times. But what exactly are smart money concepts? I don't want to bore you by giving the same old answer that these are techniques or methods used by large institutions, hedge funds, banks, etc. who are referred to as smart money due to the reason that they make smart decisions in the market, and most of these concepts are purposefully kept away from the reach of uninformed retail traders. But my outlook on smart money concepts is different. I like to view them as traps set by the big institutions to use retail orders, usually the stop loss orders, to generate enough liquidity so as to buy at discount and sell at premiums. Think of these methods as manipulations or stop loss hunting or liquidity grabbing or simply the inducement of retail traders to enter into wrong trades at the wrong time or wrong locations. I know these terms are a little over your head, but fear not, because we are going to deal with all these terms in the upcoming episodes, and I guarantee that you will love it. A lot of research, learning, preparation, and hard work has been put into making a very relevant course, and that too absolutely free of cost. I doubt if anyone would take all the pain to make genuine content for my retail trader brothers. So I request you to wholeheartedly like this video and support the upcoming videos also, and share all the episodes with all those who are willing to learn and improve their trading but don't have the money or means to do so. Also make sure to subscribe to this channel because it's free, and also enable the bell icon so that you will receive notifications when I upload the new episodes. So in this video, I would like to give an idea about the course structure and why you should learn these concepts. Then I will answer the evergreen questions like, which is the best market to trade SMC techniques? Will it work in the Indian markets? Which is the best time frame to analyze and trade smart money concepts? Or should we use the multi-time frame analysis approach? But before all that, I would like to take this opportunity to thank Wyckoff theory developed by Mr. Robert Wyckoff during the early 20th century. So you can think how old these concepts are. Actually, the whole Wyckoff method is based on the premise that the market is manipulated by a small group of traders, or so-called the smart money, who have the ability to influence market movements. These smart traders or institutions use their knowledge and resources, which include data about retailer orders and retailer behavior, and they use this information to accumulate or distribute assets before the public is even aware of their intentions. Or in simple layman terms, they manipulate the market to trap retailer liquidity. Smart money concepts or institutional concepts theory is improved by the works of Inner Circle Trader, Tom Williams, Steve Morrow, and a few others. Every now and then, these concepts are given a new look and some flashy names, but the concept still remains the same. Think of it like companies introducing their old product in a new exciting packaging, inducing you to buy these courses. So I urge you not to spend a lot of money on these expensive courses, because these series of episodes will be more than sufficient to understand the concepts and strategies. But I have an advice. I would like you to watch my courses on price action and supply and demand. The reason why I'm suggesting this is because smart money concepts, price action, and supply and demand theory are all interconnected and have a lot of similarities. It is just the terminology that changes. Most of the underlying ideas are the same. The crux of smart money concept is simply this. Markets are manipulated by big institutions and funds, and they use the liquidity of retail traders against them. Now coming to the second question, why do you as a retail trader need to learn about these concepts? And is it necessary? Actually, I can give an answer to this question in a single sentence. It is just that if you don't know where the liquidity is, then you are the liquidity. Every move in the market is in some way a trap set for the uninformed retail traders. Most of the retail traders blindly follow certain strategies, patterns, and some even call themselves breakout traders while others identify themselves as reversal traders and so on. But until and unless you don't understand how and why a price move was triggered, you will remain as a tiny fish in the ocean being hunted over and over again by the big institution or the smart money. So having a good grab of these techniques can give you a boost to your understanding on how to track the liquidity and how to capitalize on it just like the institutions. You will definitely start thinking differently and view charts with a broader perspective. Because I strongly believe that every move or even each candle formed in the market has a meaning or a logic behind it. If learned and implemented in the right manner, these concepts will definitely take you to the next level. Now, another doubt that most of you might have will be regarding the type of markets in which these concepts can be applied. To be frank, these concepts can be applied on all those markets which have ample liquidity. So, liquidity in simple terms is the ease of buying and selling of an asset without much slippages, meaning that there are enough buyers and sellers available for the smooth transaction of assets. Now, the more difficult it becomes to buy or sell an asset, the asset is said to be less liquid. Now, how do you know if the market or chart you are looking at is liquid or not? Now, there are a few ways to find this out. The most simple method is to look for trading volumes. As you may all know, trading volume refers to the number of shares traded in a particular time frame or period. It could be for 15 minutes or 1 hour or a day or a week. A high trading volume indicates that there is a lot of interest in the stock or an asset and it is highly liquid. With this, we can say that most indices are highly liquid. So to answer your question, these concepts will work well in indices like Nifty, Bank Nifty, etc. But when it comes to stocks, you will have to compare the volume of a stock with its competitors to get an idea. And along with that, we also need to look at the bid-ask spread and the market capitalization of the stock. In simple terms, the market capitalization of a stock is the total value of all outstanding shares. So a higher market capitalization generally indicates a more liquid stock as there are more shares available for trading. On the other hand, the bid-ask spread is the difference between the highest price that a buyer is willing to pay for a stock, or it is called the bid price, and the lowest price that a seller is willing to accept, or the ask price. So a narrow bid-ask spread indicates that the stock is highly liquid as there is a lot of activity in the market and the buyers and sellers are very close in their pricing. But if the bid-ask spread is wide, then the stock is less liquid or there is less activity taking place. So if you are trading in the Indian markets, I recommend you stick with the top Nifty 50 stocks or maybe just select the top 10 stocks that you like from the Nifty 50 range of stocks from different sectors. And if you are a beginner, try your best to avoid mid caps and small caps because the price action may not always be that smooth and sometimes things may not work out. But the best markets to trade smart money concepts are Forex and crypto markets, which are open for almost the entire week, thereby providing a much smoother price action. But this does not mean that all Forex pairs and cryptocurrencies are equally liquid. There is Euro USD, USD JPY, etc., which are highly liquid currency pairs, and cryptos like Bitcoin, Ethereum, etc. are highly liquid. On the other hand, there are other currency pairs like CAD-CHF or PLN JPY, or even cryptos like KuCoin or Gatecoin, etc., which are not liquid. So in short, you can use the smart money concepts to trade Forex markets, crypto markets, indices, and stocks, all of which having high liquidity. Now moving on to the second most popular question, which time frame should I choose to trade smart money concepts? To be absolutely frank, we need to follow a top-down approach. That is, we need to start our analysis from the higher time frames or the trend time frames to identify the larger market trend and mark the areas of values, and then move down to an intermediate time frame to spot nested areas of interest for refining our higher time frame analysis, and also to identify the market liquidity, and finally move down to a lower time frame to take a proper entry, set a stop loss, and place a suitable target. Now, SMC technique will work for all trading styles, whether you are a swing trader or intraday trader or BTST trader. It doesn't matter what your trading style is. I have already made a detailed video on how to select the proper set of time frames based on your trading style that you follow. So you can watch that video to know more about multi-time frame analysis. Let's say you are a curious kid and you ask me to explain what smart money concepts are in a single sentence. Then I would say smart money concepts are a few methods of identifying, planning, and executing trades on the basis of where the majority of market orders are and what the major market direction is. So in a nutshell, it all comes down to figuring out the market direction and where the major liquidity is there for taking. So as you might have already guessed, the initial step is to identify the market behavior at a particular time period. Or to be more precise, we are interested in identification of a proper market structure so that we can plan our trades based on the dominant market direction. So in this video, we are going to deal with the idea of market structure with respect to smart money concepts. Now, you may ask me, haven't we already discussed the concepts of market structure and market trends in the price action course? Actually, yes, we did. But when it comes to smart money concepts, market structure identification involves a lot more abbreviations, new terms, and stuff like BOS, chalk, strong highs, strong lows, weak highs, weak lows, etc. But the overall idea remains the same. I personally think that with smart money concepts, you will get to understand market structure and its working in a much greater detail. And in addition to this, we will also get a clarity on the major market structure and the minor or internal market structures. And we will also talk about the nature of pullbacks for both these structures. So let's get going right away. Now, you may be familiar with the fact that a liquid market or a stock or any asset goes through several market phases. Majorly, the accumulation phase, the markup phase, the distribution phase, and the markdown phase. Now, there can also be sub-phases like the reaccumulation or redistribution phases. But my point is that even though there are several phases of the market, the overall market structure boils down to three main stages or trends, namely the uptrend structure, the downtrend structure, and the sideways or range-bound market structure. Now, as you may already learned from the price action course, an uptrend is characterized by higher swing highs and higher swing lows, while downtrend forms when price forms lower highs and lower lows. And when it comes to sideways market, there is no clear trend or price action, or simply the price remains within a range. Now, this is a very basic way of understanding market structure and trends. But in this video, let's build on top of this basic idea. So in smart money concepts, we are mostly interested in trending price action when compared to sideways or range-bound price action. But this does not mean that we can completely avoid sideways ranges. And it is not the right way to think about it. Because further forward in this course, we will definitely talk about how to deal with or trade on range price action. Meanwhile, let us now focus on the two main structures based on SMC technique. Now, these are the bullish market structure and the bearish market structure. So think of a bullish structure as an uptrend with many more constraints. And on the opposite, think of a bearish structure as a downtrend, but with a lot more constraints or factors to consider. First, let us take a look at a typical bullish market structure. And yes, you are right, we need to look for higher highs and higher lows. But market structure is not always that easy to identify. It is more complicated and challenging than we think. I personally believe that if you get this particular step right, then you'll be able to get most of your trade analysis correctly. In fact,
This is the step where most people make mistakes. So when you commit a mistake at the start of your analysis itself, then naturally the rest of the process will obviously amplify the initial mistake, and finally you will be left with a corrupted and incorrect analysis in hand. And guess what? All of this will result in a wrong trade at the wrong time and the wrong location, with you making huge losses. And at the end of the day, you will have no idea where things went wrong. So my request is that you strengthen your basics first. Now with that out of the way, let us understand a bullish market structure. See, as mentioned just now, market structure will not always be very easy to identify and mark. Sometimes it can be confusing and complicated. Take a look at this chart. At a single glance, can you determine the overall market structure? Well, most of you would not be able to. Actually, this is a bullish market structure. And why do you think you are not able to identify this? The simple reason is that your eyes are not trained to look for specific details. Let me explain this. Now, you might have learned that market moves in the form of waves, and during a trending move, there is an impulse move and a corrective move. This is true, and I don't have any problems with this idea. But what needs to be added in this context is that a market structure comprises of two structures. That is, there is a major structure and there is a minor or internal structure. And as the name suggests, the major structure is the dominant structure, or it is the major structure that determines the dominant player in the market. Now, the minor or internal structure is the less important structure that gets formed within the major structure. So if you are planning to be an SMC trader, then you should train your eyes to spot these major market structures in comparison to the minor structures, because it is the major structure that majority of our trades will be concentrated on. Now you may ask me which time frame we should look for the major structures. Now we will get to this topic of time frames in a later on video. But for the time being, keep in mind that we have to look for the major structures on the higher time frames for our analysis. You can check out my detailed video on time frame selection to learn more about how to select proper time frames based on our trading styles. Moving on, let's learn how to map the major market structure and also discuss what the breakout structure and change of character is. Now this is important because it helps you confirm the major swing points. That is, it lets you confirm the higher highs and the higher swing lows in a major bullish market structure from the minor swings, which actually behaves like noise in our analysis. Similarly, it can help to confirm the lower swing highs and the lower swing lows in a bearish market structure from the minor or internal structures. Now take a look at this. The market momentum is bullish. The market created a low and a high. Then the price made a retracement or a pullback. Then once again, the price moves higher and breaks and closes above the previous high. Now this is called a breakout structure, or simply BOS, or spelled as BOS. It is also called as a continuation break as the price resumes in the major trend direction. So technically, a bullish breakout structure happens when the price breaks and closes above the previous swing high or the higher high. Please do note that the price has to close above the previous swing high level for this to be considered as a valid breakout structure. Just a liquidity sweep or simply a false breakout associated with a long wick does not qualify as a breakout structure. In addition to this, only when a bullish breakout structure happens, then only the higher swing low level is confirmed. And as you may know, a higher low is the lowest swing point, which is higher than the previous swing low level in a bullish trending market structure. Now what happens after a bullish breakout structure? How do we confirm a higher high? Now listen to me carefully. Price rarely moves in a straight line. If you observe within a larger trend, there are almost always counter trend moves. These counter trend moves are the results of lower time frame liquidity hunting. So once the price bounce or get rejected from a level, then normally it will target a previous short-term high or low before continuing in the same direction as the longer-term trend. And for some of you, this might be a very new concept. And by the way, this is called as an inducement, which is a very important topic in SMC. And we will discuss this concept in our upcoming episodes. And once we get used with all these small topics,
we will combine all these concepts to finally understand what a true SMC structure looks like and how it works in a very practical manner. But for the time being, let us go ahead and understand how a higher high of a major bullish structure gets formed using a concept that most of us are already aware of. It is none other than pullbacks. So the price breaks the previous high and it moves higher, but it cannot go higher indefinitely. At some point, it has to come down, which we call as a corrective move. So we can say that a bullish market structure is a combination of bullish impulse moves and corrective pullbacks. Now you can ask me, do all these pullbacks or corrections matter? The answer is no. We are more interested in those deeper pullbacks. Now, how do we know if a pullback is deep enough? For this purpose, we can make use of the Fibonacci retracement tool. So a deeper pullback is a retracement that goes beyond the 38.2% to 50% or even lower Fibonacci levels without closing below the previous swing low or higher low levels. The reason why we require a deeper pullback is because there is a lot of liquidity available below these internal pullback levels. And for the market to make a meaningful move, it has to tap into these retailer orders and then use these orders as a fuel to move higher. This is a very simple explanation of a much complicated concept. I hope you guys have understood what I'm trying to explain. Anyways, once we have identified a deeper pullback using Fibonacci retracement tool, we can now mark the highest point after the previous breakout structure as the higher level. And now once again, if the price moves higher and if it manages to break and close above the recent higher high formed, then again we have a bullish breakout structure. And this step will confirm the higher low level, which is in fact the deepest pullback before the breakout structure has happened. So in short, a new higher high is confirmed only after a deeper pullback has happened, which will actually sweep all the previous retailer liquidity below the internal or minor swing lows. And on the contrary, a new higher low is confirmed only when a valid bullish breakout structure happens. Now what happens when the market fails to make a new higher high? That is, the breakout structure fails, but instead the price breaks and closes below the previous higher low level. So if you have watched my price action course carefully, then you know that this is the first sign of a change in the market structure from bullish to bearish. Or in other words, we can say that this is the start of a new trend reversal. And in smart money terms, this shift in the market structure is called as a change of character or simply chalk. But do keep in mind that the price has to break and close below the previous higher low for the chalk to get confirmed. This is very important as many traders make mistake in this part, as just a liquidity sweep or a false breakout with a deep wick projecting below the higher low does not qualify. Once a change of character takes place, we will now focus our analysis towards the formation of either a bearish market structure or a sideways market structure. We should consider the possibility of both these structures until and unless we get a solid confirmation for the continuation of the bearish market structure. Let me explain this in greater detail. We know that during a downtrend or a bearish market structure, we expect the price to form lower swing highs and lower swing lows. So if you want to be an SMC trader, you have to train your eyes to find these important levels. But trust me, it is not as easy as you think. Because in most trading textbooks, we will find a very simple and straightforward method of identifying market structures. But in real market scenario, it is much more complex. So listen to me carefully. In order to confirm a lower low in comparison to the previous swing low, the price has to do a pullback. Not just any pullback, but a deeper pullback, taking out the liquidity of the previous internal swing high levels. Now you can identify if it is a deeper pullback or not by using a simple Fibonacci retracement tool and check if the pullback is over 38.2% or 50% or even higher levels. But as long as it does not break and close above the previous major swing high level, we are okay with it. Now what is the significance, or maybe what is the logic behind wanting a deeper pullback? Now the logic is quite simple, and it is associated with the retailer mentality. So as a retailer,
What will you do when you spot a breakout or a breakdown? Obviously, you will take a trade in the direction of the market break, right? Now, where will you place your stop loss? Quite clearly, you will place it beyond the breakout level. So, in case when a retailer sees a bullish breakout structure, most probably he will place his stop loss below the previous minor swing low level. And if he spot a bearish change of character, he will take a short position and he will place the stop loss just above the previous minor swing high level, right? Clearly, these swing levels just before a breakout or a breakdown, or in other words, these swing levels just before a break of structure or a change of character have a lot of stop loss orders available. These stop loss orders are in fact retailer liquidity, which the smart money is so keen to exploit. And these clusters of stop loss orders helps the smart money to buy low and sell high. Now coming to the reason why these deeper pullbacks are important. It is quite evident that these deeper pullbacks are actually searching for retailer liquidity, and once the liquidity is absorbed, the market usually tends to continue strongly in the major trend direction. So we have to look for a deeper pullback after a change of character has taken place, so as to confirm if the low formed is actually a lower low or not. Don't worry if you have not understood this concept completely. You can either watch this concept multiple times, and still if the doubt persists, you can wait for the upcoming episodes where I will talk about inducements, order blocks, etc. so that you will get a deeper understanding on the smart money concept structure mapping. Now moving on, after the deeper pullback taking out the retailer liquidity and confirming a lower low, the price moves lower and it breaks and closes below the recent lower low level. This is called a bearish breakout structure or simply BOS. I'm stressing the point that the price needs to break and close below the previous low level to confirm a valid breakout structure. Just a liquidity sweep or a false breakout with a deep wick projecting below the lower low level won't count as a valid breakout structure. Now, only when a valid breakout structure happens can we actually confirm the lower high level. So long story short, a lower swing high is confirmed only when there is a valid bearish breakout structure. And on top of that, the lower swing high is the highest point before the BOS and the previous lower low level. And all the other swing highs are just the internal or minor structures, and we don't have to give much importance to these. As an SMC trader, the major structure matters to us the most, and we conduct the analysis for our major structure on our higher time frames to get the best possible results, because in the lower time frames, charts are more random and noisy. Now once again, the price has to search for liquidity in these intermediate or internal swing highs. And in doing so, it forms a deep pullback, which sweeps the liquidity in those levels and then moves lower. Now, once the liquidity is absorbed by a deeper pullback, which can be measured using a Fibonacci retracement tool, we can confirm the new lower low level. Then again, the price has to move lower and break and close below the new lower low formed to confirm a valid breakout structure. And in turn, the highest point before the BOS and lower low will be marked as the new lower high level, and this process continues until the price fails to break and close below the previous lower low level, and instead it breaks and closes above the previous lower swing high level. Now what does this indicate? This actually signals a change in the sentiment, or it can be thought of as the first indication of a reversal. That is, the trend might change from bearish to bullish. So this shift in the market structure is called as a change of character. So now we have to change our perspective and we have to look for a bullish structure or a sideways market structure. And by now, you might already be familiar as to how to identify a bullish market structure, right? But hey, I haven't talked about the sideways market structure, right? But you may already be familiar with the accumulation or distribution phases from my price action video. These are phases where the market takes a break or where the big institutions start building their position, which is actually represented by the accumulation phases, or where they start selling their holdings, which is called as the distribution phase. Anyways, the sideways market structure can be any of them. Think of it as market taking a pause or a breather. And only when the price breaks and closes above or below
the constraints of this phase, are we really interested in making a move? So as an SMC trader or a price action trader, it is always ideal to wait out the sideways market and focus more on the trending market phases for your trades.
Let me briefly talk about the concept of strong and weak swing points in a structure. To identify strong and weak highs and lows, we obviously need to identify our structure correctly. Are we bullish or are we bearish? In this case, we are bullish. Now, keep in mind this idea that the job of a high is to take out a low. Likewise, the job of a low is to take out the high. It is as simple as that. So, if a low succeeds in taking out a high, that low becomes a strong low. In a bullish trending market structure, the market forms consecutive higher highs and higher lows. Here, the lows always manage to take out the highs. Therefore, the higher lows act as strong lows. Most of the time, these lows are protected, and as a result, when price gets to these lows, it will be met with some resistance, causing the market to move higher. On the contrary, these higher swing highs fail to take out the previous swing low levels. Therefore, these levels are weak highs. Most of the time, it is not going to hold, and eventually, price breaks through these highs. The only time it holds is when there is a market structure shift. That is, if the high manages to take out the low, thereby creating a bearish change of character. In this scenario, the previous low gets taken out and it represents a shift in control from buyers to the sellers. So now this high will become a strong high. Now there can't be two strong levels at the same time. Now this high is strong, therefore this low is already considered weak. It's like that saying, innocent until proven guilty. This low is weak until it is proven strong. This low right here would have to break this high to regain its status of being a strong swing level. Only when this high is taken out will the buyer be back in control over the market. But assume that didn't happen and the market moved lower, forming a bearish market structure. In this case, the lower swing lows were not able to take out the highs, suggesting these are weak lows. On the contrary, the lower highs did their job by breaking through the lows, suggesting that these highs are strong highs and there is a very high probability that they will hold. Or in other words, price could face a strong resistance from these highs and the market could return lower. Understanding this concept will help us trade according to the market sentiment. It tells us when to switch between trends. So the entire idea of strong and weak swing points revolve around the concept of liquidity and shift between the control of power between buyers and sellers. Now let's talk about another interesting aspect of the market, which is the fractal market structure. It is one of those key concepts that helps you find high reward to risk trades. This concept lets you refine your trade entries using a multi-time frame approach. It is known as lower time frame refinement or LTF refinement. You might already know this, so it's nothing new. But anyways, let's break this down. What you see here is a 15-minute time frame chart. Now I will bring up a series of zigzag candlesticks layered over the 15-minute chart. These candlesticks represents the 1-minute time frame. What you have to understand is that every time you have a very clean move like this on the higher time frame, a noisy price run like this is taking place on the lower time frame. For example, let's say in the 15 minutes, the market printed 5 candles like this. Then in the 1-minute time frame, it's going to print a lot more candles, precisely 75 of them, and these are going to be a lot more erratic. So the first step to follow is to identify our bias based on the major structure direction. If the major structure is bullish, our trade bias will be to trade long positions, and if the higher time frame bias is bearish, our whole objective would be to trade short positions. Okay, now take a look at this 15-minute time frame structure. The market formed a low, then a high, followed by a higher low, and then a higher high with a bullish breakout structure. At this point, we are bullish. Then, price break below the previous low, forming a lower low suggesting a change of character. So now we are bearish. That is what the 15-minute swing structure tells me. So keep in mind that as of now, the 15-minute structure is bearish, and these are our 4 major swing points. Okay, now let's bring in the 1-minute time frame structure. You can see the 1-minute chart printing consecutive higher lows and higher highs during the initial impulsive move in the 15-minute time frame. It formed minor bullish breakout structures. Then, in the higher time frame, the price made a pullback. This is how the market moves. It moves as waves, with impulse and corrective moves within it. But if you look at the 1-minute chart structure during this pullback phase, you will notice that the lower time frame structure is printing lower highs and lower lows. And as you can see, the price formed an internal change of character. This change of character or market structure shift in the lower time frame structure will give you a heads up about the pullback in the 15-minute structure. So if you were already in a long position, this minor change of character will help you exit from the trade. Now again, the 1-minute lower time frame structure formed minor bearish breakout structures. Then as you can see, the 15-minute higher time frame structure reversed higher, forming an external bullish breakout structure. But if you notice carefully, you'll find that the 1-minute structure has already given clues of a reversal. The lower time frame structure made a minor bullish change of character here. So this is a great sign for traders to enter into long trade positions. So the idea is to mark the higher time frame price of interest in the 15-minute chart, then go down to the lower time frame 1-minute chart, and then plot the lower time frame prices of interest areas to refine your analysis with a confluent setup, that is, to look for overlapping areas in the prices of interest. Now once there is a change of character in the internal structure, you can take trade entries in the trend direction from these confluence areas inside the price of interest. So a lower time frame fractal analysis will not only give you a heads up about the expected trend, but it will also help you refine your trade entries, thereby improving your reward potential and reducing your potential losses. With that idea in mind, let's quickly run through the rest of the chart and wind up this video. Look what happened next in the 15 minutes time frame. There was a change of character towards bearishness. The price broke and closed below the previous swing low to form a lower low. Now focus on what has happened on the 1-minute structure. Just like the previous case, there is an internal change of character towards bearishness, thereby printing lower highs and lower swing lows. It continued lower, forming minor bearish breakout structures. Eventually, instead of the price making a pullback and reversing back from any price of interest, the price actually broke through the previous major swing level. After that, the market once again moved higher, forming a pullback on the higher time frame structure. This pullback is identified much earlier on the lower time frame structure when it formed an internal bullish change of character. Now, if you have followed me through this video, you can easily predict what is going to happen next. It's simple. There is a good chance that the higher time frame swing high is going to be protected and that the price is going to reverse after it mitigates any price of interest. This reversal can be predicted when the price forms an internal bearish change of character in the 1-minute structure. You can look for short trade entries and trade in the direction of the higher time frame structure direction. Your target could be the next bearish breakout structure level. I hope this concept is clear.
I would like to introduce you to a completely new topic. It is known in different names in SMC, be it fair value gaps, imbalance, inefficiency, etc. But the overall concept remains the same. What you need to keep in mind is that such imbalances in the market happens due to irregular or disproportionate price movements. These price movements may deviate from what is considered normal or expected based on historical price patterns, fundamental analysis, or technical indicators. Such inefficiencies or imbalances can create potential trading opportunities for both investors and traders. But imbalances in price behavior can take different forms. Just think about it. Could be in the form of gaps, volume imbalances, spikes, lack of liquidity, displacement, etc.
Now, I will try to explain each one very briefly to get a general idea of what is what. Let's start with gaps. Price gaps occur when the opening price of a candle is significantly different from the previous candle's closing price. So, a gap has a complete absence of trading activity between two candles. Now, these gaps can be caused by various factors, such as overnight news, earnings reports, or other market moving events. And gaps can be of different types. It can be breakaway gaps, runaway gaps, exhaustion gaps, and professional gaps. Depending on the type of gap, you can choose to adopt a particular strategy to capitalize on the imbalance. I have already made a detailed video on gaps and how to trade them in my complete price action course. You can check that out to learn more. Next up is volume imbalances. A volume imbalance is a gap between the closing and opening price of two candles and the difference in between. A volume imbalance, in fact, has a trading activity happening, or there is an overlap between the high and low prices when compared to a price gap. Now, a quick example of a volume imbalance would be from this closing price to this opening price, and also we have a gap. However, the price did manage to trade through these areas, so it is indeed a volume imbalance and not really a price gap. Moving on, price spikes refer to sudden and sharp movements in a security's price, often resulting from an unexpected event or a large surge in trading volume. Now, these spikes can be caused by different factors such as market orders, stop loss triggers, or algorithm trading activity. Now, in some cases, low trading volume and liquidity in a particular stock can lead to inefficiencies, as it may result in a wider bid-ask spread and difficulty in executing trades at desired prices. So traders need to be cautious when dealing with illiquid stocks, as it can be challenging to enter and exit their positions without causing significant price impacts. Now, all these are in some form or the other a type of imbalance in the market. But when it comes to smart money concepts, we are only concerned about the imbalances caused due to displacements. So, displacement, in short, is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single candlestick or a group of candles that are all positioned in the same direction. Now, these candles typically have large real bodies with very short wicks, which suggests that there is a very little disagreement between buyers and sellers. Or in other words, only one party has a clear dominance over the other. Most often, a displacement will occur just after a liquidity level has been breached, where there are clusters of orders, and this will often result in the creation of both a fair value gap and a market structure shift. Now, we have already discussed market structure mapping and terms like BOSS, chalk, etc. in the first episode. So make sure you have a proper knowledge of the same. But right now, what we are concerned about are fair value gaps or inefficiencies or simply imbalances. So after the price reaches a particular liquidity level where large numbers of orders are accumulated, and when price reverses after absorbing the liquidity from this area, often what will come next is displacement. So these fair value gaps are usually created within these displacement moves, which means that these are instances in which we can spot inefficiencies or imbalances in the market. I have talked about liquidity levels where most of the orders are accumulated. But how to identify these levels? There is a simple rule to spot these areas. So, the last bearish candle or selling momentum before an up move is referred to as a bullish order block, where a large number of buy orders are assumed to be located. Similarly, the last bullish candle or the last buying momentum before a down move is referred to as a bearish order block, where a large number of sell orders are assumed to be clustered. Just keep this in mind and don't stress a lot, because we will learn all this in great detail in the upcoming episodes. Now you can ask me, why is an imbalance or fair value gap for that matter considered as an inefficiency? The reason is simple and straightforward. When price moves strongly in one direction, and that too by means of large-bodied candles, there is a clear discrimination between the buyers and sellers. Let me explain. Imbalance, as the name suggests, is an area of unequal market moves where there are only buyers or only sellers which exist in the market. The reason we call this an imbalance is not only because it is an imbalance between buyers and sellers, because there is literally an imbalance in the market. Trading volume is tilted either towards the bid or ask side too quickly, so there are still a lot of unexecuted orders in the market. So if we have an impulsive move to the upside, it is because there are no sellers to absorb the buying pressure of the bulls. This means that there is no resistance from sellers to stop the buyers from pushing the price up rapidly. On the other hand, if we have an impulsive move to the downside, it means there are no buyers to absorb the selling pressure of the bears. This means that there is no resistance from buyers to stop the sellers from pushing the price down rapidly. Simply put, imbalances occurs when there are many orders of the same type, be it buy, sell or limit orders, and also a lack of liquidity or counter orders in the market. For example, if there are many more buyers of a stock than sellers, then the balance can tilt in the favor of buyers. And on the chart, this imbalance looked like a price gap within which only a part of the volume has been traded. This is an unhealthy price action because it shows the disequilibrium between buyers and sellers. So an imbalance means unfair price action where the market will almost always come back to fill. Another thing to note is that the wicks do not fill each other. And if they do, then it is healthy price action or efficient price action and not really an imbalance. So to put it simply, market inefficiency occurs when the wicks are separated by a distance or a gap and they do not meet. While an efficient market, on the other hand, is one in which the wicks do not have a gap between them and they actually meet. This brings us to the next important point: how to identify or spot an imbalance or a fair value gap within a particular displacement move. To be absolutely clear, an imbalance can be defined as an imbalance between buyers and sellers. So a bullish imbalance has more buyers behind it, and obviously a bearish imbalance has more sellers behind it. So when you see an impulsive move to the upside or downside in the market with no wicks overlapping full-bodied candles, this is where imbalance in the market are formed. These can happen on all time frames. Now, when looking for an imbalance in the market, simply look for any candle which has a full real body and look for the part of this candle that is not overlapped by the previous and next candle's wick. This signifies an imbalance in the market because there were only a few transactions going on between buyers and sellers. We can clearly say that one party has overpowered the other depending on the direction of the price. Now, if you think about it, wicks usually represent price oscillating up and down within the time it takes to print an entire candle, showing that the price is efficient because there were continuous transactions happening between buyers and sellers. So it shows us that price is giving both buyers and sellers a fair chance at accessing the liquidity. So when the wicks meet, it provides the buyers and sellers an access to get into the market and profit on the price move. But on the contrary, when you see a full-bodied candle with no wicks overlapping it, it is obvious that you have identified a clear imbalance in price. This may seem very complicated and over the roof, so let me break this down further and help you understand it better. Now, a very simple method to keep in mind is to think of a fair value gap as a 3-candlestick pattern where the first candle's low does not overlap with the third candle's high in case of a down move, or where the first candle's high does not overlap with the third candle's low in case of an up move, with the condition that the middle candle has to be a large-bodied candle with little or no wicks. But there can be some exceptions to this rule, which we will look at. But first, let's take a deep dive into this concept. As I have mentioned just now, these imbalances on price chart are visualized by a 3-candlestick sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. Now take a look at this example. The middle candle is a large bearish candle with little or no wicks. Now number the candles as 1, 2 and 3 from left to right. Then consider the first candle's low and mark a horizontal line out, and do the same for the third candle's high and extend out an horizontal line. You can notice that there is a clear gap between the wicks on the first candle and the third candle, and the wicks do not meet or the high does not overlap with the low. Therefore, this can be identified as an imbalance or an inefficient price action or simply a fair value gap. Now consider another example. Here the middle candle is a large bullish candle with little or no wicks. Now number the candles as 1, 2, 3 from left towards right. Then extend a horizontal line from the first candlestick high and do the same from the third candlestick's low. And you can clearly notice that the high and low wicks do not overlap with one another. So we can say this price action is inefficient or not healthy. So this is a fair value gap. Now let's take a look at some of the tricky situations which you could encounter in the charts. On some occasions, you will not be able to apply this rule directly, and you might need to focus on some more important factors before plotting a fair value gap. Observe this over here and tell me, how will you mark the imbalances in this case? So if you look at this diagram, this candle here is our last bullish candle or the last buying momentum before the price drop. So most of you will mark this bearish candle's low, which formed after the last bullish candle, as number 1. And some people might even mark the bullish candle's low as number 1 and then mark the third candle's high. Now, in either case, this is not a valid imbalance. And why is it so? If you look at the left side, there is a bearish candle before this up move. And you will notice that the high and low of this bearish candle is protected, meaning that the candle's high and low are not broken by the up move. So if the market creates anything between the high and low of this bearish candle, all those moves are considered as internal moves only. So in such scenarios, first of all, you have to check if the previous candle's highs and lows are broken or not. Then only you have to number the candles as 1, 2 and 3. So here, this bearish candle has to be numbered 1 and this candle's low is to be marked or extended using a horizontal line. The next candle which has broken the bearish candle low is our second candle, and finally, we will also mark the high of the third candle. Now this becomes our valid imbalance, which the market might return to fill or absorb. So keep in mind that internal price moves are not to be considered while marking proper imbalances. Now a lot of people will wait for the price to fill this particular imbalance and they will look for short trading entries. But this is not a valid imbalance. This would have been a valid imbalance if the market would have broken this bearish candle's low. So now the bearish candle is no longer considered. Now when you mark the imbalance, you can consider the bullish candle's low and number it as 1. But the next bearish candle is not taken into account because it is an inside candle which was unable to break the highs and lows of the bullish candle. So our second candle in this case would be this bearish candle which has broken the low of the bullish candle, and then the third candle high is also marked, and the difference will become our imbalance. Now there can be another scenario when the high of the last bullish candle has been broken. Now how will you mark the imbalance in this case? So here, this bearish candle is no longer an inside candle, and thus we can number it as 1 and mark its low, and subsequently we can number the other candles as 2 and 3 and mark the high of the third candle, and thereby we can observe the imbalance. I hope you guys have understood all these different scenarios. Now, I want you to mark the imbalances for these 3 scenarios on your own. Just pause the video and do it by yourself. The answer will appear on the screen after 5 seconds. So try it right away. So now that you have understood what a fair value gap looks like, let's also make sure what it does not look like. Like before, extend a horizontal line from the first candle's low and another line from the third candle high to see if there is a gap. When dragging the high and low across, you can see that they overlap. This means that the low from the first candle is lower than the high from the third candle. So there is no gap or inefficiency there, and thus this is not a fair value gap. Similarly over here, if we were to extend the first candle's high using a line and also extend a line from the third candle's low, you can see that there is an overlap between the first candle's high and the third candle's low, meaning there is no imbalance or fair value gap. So now just to clarify, a gap between the first candle's low and the third candle's high, or the first candle's high or the third candle's low, is what creates a fair value gap. Now I want you to find such imbalances or fair value gaps on different charts and mark them on your own by this simple method. The next thing we are going to look at are CDs and BCs. These are nothing new. It's just the same concept in a new name and packaging just to induce curiosity. So a CD stands for a sell side imbalance and buy side inefficiency. What does this mean? It means that the sell side was offered, but the buy side wasn't. So it is inefficient. Or simply put, it represents a bearish fair value gap where the bears have overpowered the bulls. It is also known as undervalued fair value gap. What it means is that the price of the asset is lower than its fair value gap. In this case, the price might increase in the future to balance this inefficiency in price. Now, a BC stands for buy side imbalance and sell side inefficiency. This means that the buy side was offered, but the sell side wasn't offered. So it is inefficient, or it represents a bullish fair value gap where the bulls have overpowered the bears. It is also known as overvalued fair value gap. What this means is that the price of the asset is higher than its fair value gap. Now, in this case, the price might decrease in the future to balance this inefficiency. So if we look at this price action right here, we have a bearish fair value gap where the sell side is offered, but the buy side is inefficient. So this creates a CB. Now, if you look over to the right, you can see that the price has made a bullish fair value gap or a BC because it offered the buy side, but not the sell side. And that's all about BC and CB. And I hope that clarifies some things for you guys. Now, another relevant question worth asking is, why do market imbalances occur? The emergence of persistent price imbalances in one direction after long periods of stable or efficient pricing indicates that institutions are accumulating positions. Now, these institutions can be funds, banks, and other financial institutions that we call smart money. But do keep in mind that the market is influenced not only by institutions, but also by market makers, investors, and traders with large capital. For example, smart money can place many orders and then modify or cancel them to bring the market back to an equilibrium state. These market makers, traders, and investors can oppose each other, and they can also act in the same direction. In most occasions, imbalances in the market can occur after the release of an economic or geopolitical news. The reasons can vary on whether you're dealing in forex or in other markets. It could be the publication of financial statement. For example, a very positive quarterly report can lead to an imbalance towards buyers. Similarly, it can be corporate announcement of bankruptcy, management changes, takeovers, business purchases, etc. It could also be governmental and regulatory actions, interest rate changes, etc., which could contribute to the imbalance. It could even be political problems, natural disasters, etc. Now, since you have understood what a fair value gap or imbalance is, now you can ask me, how is it useful for traders like you and me? Now, as mentioned earlier, imbalances in the market can be viewed as inefficiency in price behavior, telling us that maybe banks or big financial institutions are involved in the aggressive movements of prices that we are seeing. Again, if you think about it, most impulsive moves and imbalances in the market happen as a result of there being no liquidity in the form of counter orders to stop the price from being met with resistance and thereby slowing down. Now, if you consider an efficient market, we get to see the price trade within a range of fair value for that particular asset, where the sellers will sell when they perceive that the price of the asset is high or the price is trading at a premium, and the buyers will buy when they perceive that the price of the asset is low or is trading at a discount. This is not the case of an inefficient market. The big institutions will create a high momentum move and an imbalance in the market that is much like a gap in price. In most cases, this price manipulation can be a part of institutions' plan to generate liquidity to buy low and sell high, and therefore we may see the price coming back to fill that imbalance or close the price gap before pushing back into the same direction that the price made the impulse move from. And now, to answer the question, how can we as traders benefit from such imbalances? Imbalance is a type of trading opportunity for both intraday and swing traders. In trading, imbalances are used to identify zones of interest. We will talk about these zones of interest, which is more commonly known as order blocks, in the upcoming episodes. The zone from which the imbalance originated is characterized by a higher level of probability. This zone is suitable for analyzing and identifying potential trade entry points. The entry points can be selected with the help of technical analysis within the selector trading methodology. In this case, imbalances act as an additional factor in favor of the trade. So naturally, most imbalances in the market represents an inefficiency in price and therefore there is usually a good chance that the price will return to fill that imbalance in order to make the price efficient again. Now, I cannot guarantee that the price will always come back to fill the imbalance, but in most scenarios, the price will return to fill the imbalances that form in the market. Because it is a rule of nature that everything wants to come to rest or to be balanced. In the same way, the price also wants to remain in balance. So when an imbalance is created, the price tries to balance it, and the imbalance gap between the wicks of the neighboring candles acts as a price magnet. It means that as the liquidity fills, the price will close the imbalance. This is what we call as mitigation in smart money concepts. Or when we say that the price has mitigated the imbalance, it means the imbalance has been filled and efficient price action has been restored, and the market will most likely continue in the direction of the impulse move. But do keep in mind that mitigation is more a general term which can be used to indicate a filling of a price gap, filling of an order block, etc. We will talk about this topic in more detail in the upcoming episodes of this course. As you are aware by now, imbalances represent price inefficiency. Therefore, there is a high probability that the market will come back to fill the imbalance. For example, if a large bidder has manipulated the market, a correction might occur afterwards. Typically, price tends to mitigate the imbalance or the area from which it originated. Therefore, we can look to take a trade in the direction of the imbalance in order to profit from the price movement. In this way, we will be able to buy low and sell high like the institutions. However, there are times when the price will just continue to push back against the imbalance that are forming in the market. I won't go deeper into the trading aspects of this concept in this video. We will discuss different SMC trading techniques once we have covered all the basic concepts that guides the SMC theory. Now, I want to talk about some advanced concepts regarding fair value gaps. I won't force you to learn these, but it is worth knowing as it would help you to trade with better conviction and accuracy. Now, there are three things to look out for within a fair value gap. The first being the start of the fair value gap, the second being the consequent encroachment or the 50% of the fair value gap, and lastly, where the price completely fills the fair value gap. We can make use of the Fibonacci tool to mark these levels within these fair value gaps. When the price returns to the fair value gap, we should look for a few different things. This will give us a better idea if the fair value gap is respected by the price or should it be considered invalid. I will be considering a bearish fair value gap or a CB for this purpose. So first, the price can either reach up into the fair value gap but close outside the fair value gap and continue lower. Price can also reach up into the consequent encroachment or 50% of this fair value gap. In this case, we would like to see the candle close outside the fair value gap, but as long as the price is respecting the consequent encroachment, we can be pretty flexible with the price closing just below the consequent encroachment. Sometimes the price can also reach up to fill the fair value gap, and in such cases, it is preferable to see the price closing outside the consequent encroachment of this fair value gap. The most important thing to look for when invalidating a fair value gap is where the price closes. So when the price starts to close over the consequent encroachment or outside of the fair value gap, it is an indication that the price is not respecting the fair value gap, and most of the time, price will not reverse back down and the CB is deemed invalid. Now let's look at a few examples to understand this concept better. So we have a CB right here. Let's mark out the consequent encroachment using Fibonacci tool and see what happens. So you can see when price reaches up into this fair value gap, does not close over the consequent encroachment, or in other words, price respect the fair value gap and it is still valid for a reversal to happen. Now let's take a look at another CB right here. Let's mark out the consequent encroachment. You can see that the price did not respect the CB at all and closed right through it. This is when we will invalidate a fair value gap because the price is not respecting it. Now, if you look at a busy or a bullish fair value gap right here and mark out the consequent encroachment to see what happens. The price reaches into the fair value gap and closes out. So it is currently respecting the busy and it is still deemed valid. Another case is when the price breaks out and closes below the busy, and in that case we can confirm that the price is not respecting the busy and it can be regarded as invalid. The next thing we are going to look at is fair value gap inversion. To explain this in simple terms, Inversion happens when a fair value gap fails or when the price closes through it, and then this fair value gap can be used as a support or resistance for future price movements. What this means is that I would expect price to return back to this old CB to use it as support and move away. Similarly, price could return back to an old BC to use it as a resistance and then move lower. Another thing to note is that this does not have to happen back to back, meaning that this can occur later on after a period of consolidation. Let's look at some example to clear things up. So we have a CB right here and the price closes through it. So it is considered invalid. But that does not make it useless. We can then look to see if the CB supports the price. And we can clearly see that this old CB acted as a support for prices before getting a move higher. Here's an example of what I mean when I say that the fair value gap inversion does not need to occur back to back. So we have considered another BC, and right here we get a close below this fair value gap. So it is deemed invalid. Now let's see what happens when price returns to this old BC. You can see that the price returns to this old BC. It uses it as resistance to go lower. But this did not happen suddenly, and the price took a while to return back to this BC. For our next example, we have a CB right here. So let's see how the price reacts to it. And you can see the price has filled this fair value gap, but the price closes out of it. So it is currently respecting this CB. But right after this, we can see that the price closes over this CB, invalidating it. Now let's see if an inversion happens when the price returns. And you can clearly see how the CB was used as support and the price returned.
We are going to discuss two important concepts in SMC. These are liquidity voids and vacuum blocks. So in this video, I will talk about liquidity voids and how they are different from a fair value gap. Then we will talk about vacuum blocks and their formation. We will also investigate the reasons why liquidity voids and vacuum blocks are formed on the charts. We will also look at the different types of liquidity voids and vacuum blocks. And finally, we will briefly discuss what to expect from these areas. I have mentioned that fair value gaps and liquidity voids are related concepts. Let us understand this first. So, if you have watched my video on fair value gaps and imbalances, you already know what this is. In that video, I have mentioned that after the price reaches a liquidity level and then reverses from it after sweeping the liquidity from that level, what will often come next is displacement. The fair value gaps are created within this displacement and are defined as instances in which there are inefficiencies or imbalances in the market. These imbalances are visualized on the chart by a 3-candle sequence containing one large middle candle whose bordering candles' upper and lower wicks do not overlap. So, a bullish fair value gap is a 3-candle pattern where the high of the first candle does not overlap with the low of the third candle, leaving a gap in between. Similarly, a bearish fair value gap is a 3-candle formation where the low of the first candle does not overlap or cross the high price of the third candle, thereby leaving an imbalance in between. In this definition, what you have missed is the term displacement. Displacements are nothing but liquidity voids. So displacement in short is a very powerful move in price action resulting in strong selling or buying pressure. Generally speaking, displacement will appear as 2 or more strong candles that are all positioned in the same direction. These candles typically have large real bodies and very short wicks, suggesting very little disagreement between buyers and sellers. Or in other words, there exists an inefficiency in prices. Often, a displacement or liquidity void will occur just after a liquidity level has been breached and will often result in the creation of fair value gaps and a market structure shift. We can also think of displacements in relation to fair value gaps. At least 2 back-to-back fair value gaps will indicate a strong push in prices, resulting in a displacement. Usually, these liquidity voids or displacement moves form after a period of consolidation, and then the price suddenly moves up or down very strongly, printing one or more large-bodied candles. This means liquidity voids are areas on the price chart which is characterized by a lack of significant trading activity or volume.
They typically occur after a rapid price movement, leaving behind a region in the chart where the trading was thin or almost non-existent. This phenomenon often happens because most market participants were not interested or were not able to trade at these levels, either due to a lack of perceived value or because the market moved too quickly for them to react. You can see this phenomenon every now and then across all different time frames. The peculiar thing about liquidity voids is that they almost always fill up. And by filling, I mean that the price will return to the origin of the void. The reason for this is that during the void formation, an imbalance or inefficiency is created in prices that has to be balanced. The erasure of this imbalance is what we call filling of the void. And while some liquidity voids waste no time in filling, some others take multiple periods before they get filled. Now let's take a look at bullish and bearish liquidity void formation. Here, you can observe how prices crash down from a consolidation area. The price formed a group of big bearish candles with large real bodies and little wicks as it moved lower. Clearly, the selling pressure is the dominant force here. There was literally no buying activity here. This means there is an inefficiency in the market. This is a typical case of sell-side imbalance and buy-side inefficiency, or in short, CB. I know I have asked you to relate CB and BC to fair value gaps, but the definition of CB and BC holds true for liquidity voids also. This means there were not enough buying transactions to counter the selling pressure, leading to a sell-side imbalance, and the lack in buying pressure remains as an inefficiency that needs to be filled. So we can expect the price to return back and fill this bearish liquidity void that was created. Do not expect the price to fill the inefficiency all at once. It will generally take time. At the first stage, we can expect the price to return back to fill the 50% of the liquidity void. Then it might come back again to fill the rest of the imbalance. So a typical example of this bearish liquidity void can be observed on the 1 month time frame of Nifty chart during the Corona crash. You can see two big candles crashing lower, generating an imbalance. But over the course of the next few months, you can see how the price returned back to mitigate the imbalance caused by the liquidity void. I won't be giving you any trade entry methods or strategies in this video. This is just a conceptual video to get your SMC basics right. We will talk about different strategies and risk management techniques in the second season of the SMC course. Anyways, in a similar manner, we can identify bullish liquidity voids. Here, you can see how the prices explosively moved up higher from an area of consolidation. As you can see, the price formed a group of big bullish candles with large real bodies and tiny wicks as it moved upwards. It is obvious that the buying pressure is the dominant force here. There was no effective selling activity to counter this price rally. This means there is an inefficiency in the market. This is a clear case of buy-side imbalance and sell-side inefficiency, or BC. What this means is that there are not enough sellers or selling transactions to counter the immense buying pressure, leading to a buy-side imbalance, and a lack in the selling pressure remains as an inefficiency in the market that needs to be mitigated. So we can expect the price to come back and fill this bullish liquidity void that was generated. As mentioned before, this void filling won't have to happen abruptly, but over time, these liquidity imbalances will be dealt with. If we draw a Fibonacci retracement containing only the 0%, 50% and 100% levels connecting the high and low of the liquidity void, then we can anticipate the price to fill at least till the 50% of the imbalance in the first stage. Eventually, the price will fill the void entirely. You can take a look at this example to see how the buy-side imbalance was completely filled over the course of time. The great thing about trading liquidity voids is that they are present across all time frames, and so they can be used across all these time frames. The implication of this is that traders of all trading styles can hope to benefit from it. Intraday traders can go down to 15-minute chart to trade them. Scalpers can even go as far down as 1-minute chart, and swing traders can also take advantage of liquidity voids on the 4-hour and even higher time frames. Now, let's just briefly talk about how to approach our trades to benefit from these voids. If you have understood what liquidity voids are, You may already have an idea of how to trade them. You know that since the void almost always gets filled, your hope is in trading the fill. And how do you trade the fill? Or how do you know when the price is about to reverse to fill the void? So the first thing to look out for when attempting to predict where the price may start the void filling reversal is to look for liquidity zones before the void. These liquidity zones or pools are often in the form of supports and resistances. This is where you can expect the price to reverse from and fill the gap. Another way to spot areas of potential reversal for filling of the void is to look for liquidity zones that have developed after the void. Now, you will find the price going up and down around this zone. However, you can only use this method when the filling of the void does not happen abruptly. That is, the price consolidates for some time, creating a liquidity zone that can be tapped into. Now let's move on to the second concept, which are vacuum blocks. As the word vacuum suggests, there is a complete absence of trading activity. By definition, it refers to a specific area on price chart where rapid price movements has occurred, leaving a noticeable gap or vacuum in the market. Unlike liquidity voids, where there was either a dominant buying or selling pressure, resulting in an imbalance in prices, vacuum blocks are associated with no trading or transaction in between, leading to gaps in the charts. In the price action context, these are called price gaps, and in SMC, it is known as vacuum blocks. Just like liquidity voids, vacuum blocks also represent inefficient price action. These vacuums are crucial in predicting future price movements as they often act as magnets, drawing the price back to these zones for a retest or to fill the gap. Let me explain this. In practical trading, a vacuum block operates by leveraging the market psychology behind sudden price movements. When price rapidly moves away from a certain level, it often leaves behind a region with little or no trading activity. This is a vacuum block. These are formed as a result of any high volatility event or news or even during session openings. Most experienced traders would monitor these areas as they can act as magnets for future price action. So when the price revisits or retests these zones, it can trigger a strong reaction, either continuing the initial trend or reversing it. The price revisits this vacuum block to fill the inefficiency in price action. But keep in mind that not all gaps are filled completely, and some gaps take a lot of time to get filled. Vacuum blocks are also classified into two types based on its formation. These are bullish vacuum blocks and bearish vacuum blocks. A bullish vacuum block is a gap created in price action when price opens way higher than the previous candle. To mark the vacuum block, we have to consider those two candles between which the gap was formed. Then, we need to mark the highest point of the first candle and the lowest point in the second candlestick. This will be our bullish vacuum block or simply a gap up. Now, a bearish vacuum block is a gap created in prices when the market opens lower than the previous candle. To mark a bearish vacuum block, we have to consider these two candles between which the gap formation took place. So all we need to do is to mark the low of the first candle and the high of the second candlestick. This will be our bearish vacuum block or simply a gap down. These gaps are formed due to liquidity vacuum, which is directly related to any events. You can see these sorts of gaps forming every now and then in our Indian indices, which is primarily due to overnight sentiments following some global or domestic events or news. Occurrence of such vacuum blocks are comparatively rare in case of forex markets because these markets function almost 24/7, so every news is factored in. Due to this, we might see a lot more liquidity voids getting formed rather than vacuum blocks in forex markets. This is another area where liquidity voids and vacuum blocks are related. Both these areas are formed as a result of some volatile event in the market. Usually, these are related to some news that induces a lot of buying or selling. This increased number of buy or sell orders at any given prices will result in price keeping certain price levels, resulting in a vacuum block in case there is a time delay between the market close and the market open. And in other cases, if this surge in buy and sell interest happens during the market hours, it will result in large candles in the same direction, resulting in an imbalance or a liquidity void. I hope things make sense. Now, if you want to know how to make use of this vacuum block concept to take your trades, you can watch my video on price gaps in my free price action course, or you can wait for the next season of this SMC course. Moving on, vacuum blocks and liquidity voids can be classified into four major categories depending on where they appear on the chart. And of these four, only two tend to get filled quickly. The others take some time to fill up. These include common liquidity voids and common vacuum blocks, exhaustion liquidity voids and exhaustion vacuum blocks, breakout liquidity voids and breakout vacuum blocks, and finally, we have runaway liquidity voids and runaway vacuum blocks. Let's briefly look into each one of them. Common liquidity voids and common vacuum blocks appear randomly on the chart. Often there is nothing more to their formation on the chart beyond their mere appearance. These are formed at random locations, or in other words, they have no underlying price action meaning in the market, or maybe not something that I know of. But one observation that I have made is that these common voids and blocks are formed within ranges. That is, when the market trades between a certain range, you will come across them. And 80 to 90% of the time, these liquidity voids and vacuum blocks get filled. Now moving to exhaustion liquidity voids and exhaustion vacuum blocks, these happen at the end of the trend. As the name suggests, these get formed when the market loses steam and is nearing an end of a particular trend. And when this happens, the market forms a vacuum block or a liquidity void, indicating a trend reversal. Now, talking about breakout liquidity voids and breakout vacuum blocks, as the name suggests, breakout voids and blocks happen when the price breaks out of a support, resistance, or a liquidity zone. After the formation of a breakout vacuum block or a liquidity void, price will most probably return to fill the imbalance and then move in the direction of the breakout. Finally, let's talk about runaway liquidity voids and runaway vacuum blocks. These are considered as continuation voids and blocks because of where they appear on the chart. These happen in a market with an already established trend, and they appear in the direction of that trend. Runaway liquidity voids and runaway vacuum blocks don't fill on time, as they often serve as continuation of the trend.
Take a look at these two figures. Can you identify what these are? Write down your answers in the comment section. So, the first figure represents a price gap or vacuum block, while the other one shows a volume imbalance. We have already learned in detail about vacuum blocks. So, in this episode, we will focus on volume imbalances. It is a subtle but a very powerful concept that helps understand where institutional orders may have caused inefficiencies in the price delivery. It is a visible inefficiency in trading volume between buyers and sellers, often identified by aggressive buying or selling within a short time. The market often revisits these imbalanced areas, using them as critical support and resistance levels that influence future price behavior. Price often reacts at these levels, which indicate accumulation of orders. And these areas or zones are typically used by smart money traders to identify potential entry and reaction points. So in this video, I will talk about volume imbalances, its significance in trading, and I will also provide actionable strategies to leverage this concept for improving your trading outcome. So without wasting any more time, let's get started. In the market, gaps and volume imbalances are key indicators of market inefficiencies. These two concepts revolve around the key notion of SMC concepts that markets are driven by institutional order flow, and it is constantly moving between states of balance and imbalance. And as you may all know, a gap or vacuum block represents a price area on chart where little or no trading activity has occurred. In candlestick terms, it is an area between the closing price of one candlestick and the opening price of another candlestick. But for practical purposes, we will only consider the highs and lows of two consecutive candles. These gaps are a result of sharp price movements, low liquidity, and order imbalance. And one such gap formation is the volume imbalance. A volume imbalance occurs
when there is a distinct separation between the bodies of two consecutive candles on a chart with no visible overlap between them. What this means is that the wicks of these candles may or may not intersect, but the candle bodies themselves do not touch. This separation represents a gap in price action, signaling that the market did not efficiently deliver the price between these 2 points. This creates a volume imbalance, or it is also known as a micro fair value gap. The formation of such gaps in charts can be attributed to various market conditions. For instance, the market may close for the weekend and reopen with a gap due to new information or developments that occurred during the weekend. Other than that, sudden and unexpected market movements such as economic announcements, geopolitical developments, or even large institutional trades can lead to rapid price movements, creating such gaps. But inefficiencies such as volume imbalances are not like these traditional gaps or vacuum blocks. These imbalances are also found within live price action, and it happens during rapid delivery phases. These imbalance zones are the areas where the buy and sell orders could not match efficiently, which in turn leaves a void in the form of body-to-body gap between candlesticks. Just like vacuum blocks or fair value gaps, volume imbalances play a critical role in market behavior because volume imbalance represents an inefficient delivery of price. These inefficient zones often act like magnets, attracting the price back to these areas before continuing in the intended direction. Here, the underlying idea is that the market is driven by institutional algorithm and smart money. So, price often return to these areas to fill the gap and rebalance the order flow. This means volume imbalance can either serve as a continuation area or a reversal area. But this is highly dependent on the broader market context or what the major market structure is doing. Therefore, understanding how these imbalances form and how they can influence future price movements is essential for developing a robust trading strategy. Now, let's learn to identify a volume imbalance properly. The formation of volume imbalance is slightly different from the formation of a fair value gap. In order to identify a volume imbalance correctly, we need to analyze 2 candles properly, unlike 3 candles in case of a fair value gap. Let's start with a bullish scenario. So, in a bullish market scenario, the first candlestick represents the price level before the impulse move begins. We can mark the close price of this candle. For a bullish volume imbalance, the second candlestick needs to open higher than the previous candle's close, just like this. We can mark the second candle's open price. This body-to-body gap is our bullish volume imbalance. The opposite case is applicable for a bearish scenario. In the bearish scenario, we will closely examine the close of this first bearish candlestick. For a bearish volume imbalance, the second candlestick needs to open lower than the previous candlestick. There should be a visible body-to-body gap between these 2 candlesticks. So the key to volume imbalance is the gap between the bodies of the first and second candlestick. There is a possibility that the wicks of these 2 candlesticks may overlap, but the body-to-body separation is what defines the volume imbalance. But what is more important is understanding the context and confluence surrounding a price imbalance. While volume imbalances or other types of gaps may visually appear attractive, not all of them carry the same level of probability. So I will now be talking about high probability and low probability volume imbalances. So let's talk about high probability volume imbalances first. A high probability volume imbalance is one which is backed by supporting structures or elements from the PD array. These arrays usually include key SMC tools like order blocks, breaker blocks, fair value gaps, liquidity voids, etc. So when a volume imbalance aligns with one or more of these concepts, it implies that the imbalance is not just a random inefficiency, but it is a strategic zone where smart money has participated. This will significantly increase the weight of the imbalance and thereby increase the probability of the volume imbalance. For example, a volume imbalance is considered as high probability when it is aligned with any of the reference areas of a PD array, supports the current or developing institutional order flow, and it is aligned with the market structure context. On the other hand, A low probability volume imbalance exists in isolation. There may not be any significant supporting structure on its left-hand side or any surrounding context. If it is just a gap that appears in the middle of the price action without any PDRA elements like order blocks, fair value gaps, or breaker blocks nearby, then it is considered as weak and it is unlikely to hold any importance for the smart money players. These low probability imbalances may simply be the result of the retail driven volatility, short term liquidity hunts, or structural noise in the market. Acting on such gaps without confluence can lead to poor trade entries and losses. So, the key difference between high probability and low probability volume imbalances lies in their market positioning, its alignment within the PDRA, and their confluence with other SMC tools. Moving on, I will now tell you why volume imbalances matter in trading. See, a volume imbalance is not merely a visual gap on the chart. Instead, it represents a deeper understanding of the market dynamics that can significantly influence your trading decisions. So, here are some of the reasons that make volume imbalances highly significant. First of all, it is very helpful in predicting market reversals. You see, volume imbalances often precede market reversals, acting as an early signal to the changes in the trend direction. The magnetic nature of these imbalances draw the price back to the key levels of supply or demand before the market reverses to continue its existing trend. So, these imbalances will allow you to anticipate potential turning points in the market and thereby adjust your strategies to take advantage of these movements. The second feature is that volume imbalances can act as supports and resistances for prices. For example, if a volume imbalance serves as a support level, the price may revisit this area and then move upwards. Conversely, if it serves as a resistance, the price may struggle to break through and could potentially reverse, leading to a downward movement. But do keep in mind that this idea should not be used in isolation. Rather, you need to look for confluence setups that improve the probability of success. The third benefit is that traders can utilize volume imbalances as entry points by treating them as micro fair value gaps. Once these gaps are filled, they can reinforce the market support or resistance levels. Additionally, volume imbalances can draw price towards them, thereby providing a clear target for price movement, which is particularly useful when exiting trades. This will result in better trade execution and higher probability. Another associated benefit of volume imbalances is that it will support your risk management. These volume imbalances can offer clear price levels for setting your stop loss orders. When a trade moves against your position, these imbalances can provide logical exit points, thereby minimizing potential losses and enhancing overall risk management. Now, let's talk about the strategy part. See, trading is not just about drawing lines and marking zones on the chart. Likewise, it is not just about spotting a fair value gap or order block on any random time frame. Trading with SMC, or in fact trading in general, is all about building a logical narrative around the market structure, liquidity, and institutional behavior. To do this effectively, you must incorporate your higher time frame bias, PDRA confluence, and market structure shift across multiple timeframes. If you want to become an effective SMC trader, then using these concepts together to filter out weak setups and thereby enhancing your trade accuracy in both bullish and bearish conditions is the proper way to go about it. Always keep this in the back of your mind. So, the first and most influential thing is understanding multiple timeframes and their alignment. This involves using a top-down approach where you begin your analysis from your high timeframes. This will help you to understand the broader market context and structure. So, higher timeframes like weekly, daily, 4-hour, or even 1 hour can be used for analyzing the market structure and trend bias. Once the higher timeframe bias is set, then you can shift to your lower timeframes like 15-minute, 5-minute, or even 1-minute charts to find entry confirmations around these imbalances. But you need structural confluences for your entries. PDRAs will help provide them. When multiple elements of SMC concepts align with your higher timeframe structure and directional bias, the setup becomes high probability. For example, Take a look at this bullish market scenario. I have considered this particular bullish swing leg. I have also plotted the premium and discount zones of this swing move. Here you can see a bullish volume imbalance formation. Now, if you observe closely, you can see that a bullish fair value gap sits closer to this volume imbalance inside a discount zone. There could also be situations where you can get an order block also along with a fair value gap and volume imbalance, thereby offering triple confluence like this. This particular setup constitutes an inefficiency, institutional interest, and discount pricing. This stacked alignment will give you a precise zone to take your entries from. Since volume imbalances can act as micro fair value gaps or a support level in this particular case, we expect the price to retrace back into this zone. Once price returns to this zone, you need to wait for a price action confirmation like a change of character or market structure shift on your lower time frame before taking an entry. Now, a lower time frame market structure shift can be used as a powerful confirmation tool in SMC that can present a transition in control. So in this case, we can see a transition from sellers to buyers because in the lower time frame chart, the corrective move will look like a bearish trend. The opposite is also true. A market structure shift represents the transition from buyers to sellers in a bearish scenario. So market structure shift will help you avoid taking premature entries. So in short, a higher time frame bias paired with a lower time frame bullish market structure can tell you that the market is transitioning into a delivery phase and it is ready to continue in the previous trend direction. And finally, we can place a long trade entry when the lower time frame bullish market shift happens, or you can wait till the market makes another break of structure before an entry for additional confirmation. You can set your stop loss below the lowest point before the change of character happened. Your primary target would be the next draw on liquidity, which in this case would be the previous swing high level on the higher time frame structure. This is a higher reward to risk setup. And as you can see, prices rallied higher after reacting from our zone of interest. Now, even though volume imbalances are a powerful tool, they are not completely foolproof. For consistent high probability trades, it is important to use them in conjunction with other SMC tools for better and mature trade entry and exits. These concepts work across all liquid markets and it provides you with a structured and disciplined framework for navigating the market like smart money. Take a look at these two figures. Can you identify the difference between the highlighted portions? Obviously, both of them are fair value gaps. There is no doubt about it. But let's see what the price does next. And this is what happened. Now tell me, what do you observe? In the first scenario, price respects the fair value gap and it reverses, while in the second scenario, price mitigates the imbalance and breaks below the fair value gap, which was unable to hold the price. A broken fair value gap like this is not trash or useless. Instead, it is equally useful like a fair value gap for prices, but in the opposite direction. So this is what we are going to learn today. In this episode, we will learn in detail about inverse fair value gaps, from its formation to identification and how to use them for our trading. This is going to be a very informative video. Let's begin with a brief introduction on what a fair value gap is. Basically, a fair value gap is a 3-candle structure indicating a gap between the high and low of the first and third candlestick as shown on the screen. It could be a bullish fair value gap or a bearish fair value gap depending on the direction of its formation. A fair value gap, as you may already know by now, represents an imbalance or inefficiency in prices in the market. And imbalance, as the name suggests, represents an area of unequal market movement where there are either only buyers or only sellers existing in the market. There is an unhealthy price delivery because it shows disequilibrium between buyers and sellers. So an imbalance means unfair price action. Another important thing to note is that the wicks do not fill each other. And if they do, then it is healthy price action or efficient price delivery and not really an imbalance. An efficient market
is one in which the wicks do not have a gap between them and they actually meet. So, to put it simply, market inefficiency occurs when the wicks are separated by a distance or a gap and they do not meet or overlap. So, when there is an imbalance in prices, the market always tries to balance it. Therefore, fair value gaps acts as price magnets, always attracting the market towards it. Now, that's a quick recap on fair value gaps and imbalances. Now, let us understand what an inverse fair value gap is. An inverse fair value gap, also known as inversion fair value gap, is a failed fair value gap which is not respected by the price. In other words, an inverse fair value gap forms when a fair value gap gets run through or it fails to hold the price and the price goes beyond breaking the fair value gap. Now, to identify an inverse fair value gap is very easy. At first, you need to identify a fair value gap formed in prices. After identifying a fair value gap, look for a price retracement back to this fair value gap. But instead of respecting this fair value gap and reversing in the prior direction, price should close beyond the fair value gap, thereby forming a break in the opposite direction. So, when a fair value gap is broken, you can mark it as an inverse fair value gap or an IFVG, and you can use it to trade in the opposite direction. In fact, an inverse fair value gap signals the most initial shift in the price momentum. You see, on most occasions, when price returns to balance a fair value gap, it respects the fair value gap, reverses, and then continues its move in the ongoing trend direction. But when a fair value gap gets violated or run through, it acts as an inverse fair value gap, and usually it signals the first shift in momentum of price, which can result in a short retracement or a change in direction later. This is most significant when you move down to your low time frames like 1 minute or 3 minutes. You can also see this happen during the manipulation phase in the market. I will talk about this soon enough. But first, let me discuss the different types of IFVG. Since fair value gaps are of two types, so the inverse fair value gaps also has two types. There are bullish inverse fair value gaps and bearish inverse fair value gaps. So a bullish IFVG is basically a bearish fair value gap which is violated by the price by breaking and closing above it. So first of all, you have to identify a bearish fair value gap, and when price breaks and close above the bearish fair value gap, it becomes a bullish inverse fair value gap. So the key points to keep in mind is that a bullish inverse fair value gap gets formed from a bearish fair value gap. Secondly, we need a proper break and close of a candle above this bearish fair value gap to be considered a bullish IFVG. A candle wick popping just above the bearish fair value gap like this won't suffice. We need to make sure that the candle body closes above the bearish fair value gap. Now, once your bullish inverse fair value gap is identified, it could now act as an area of support for prices. Therefore, we could expect the prices to push higher from this area of support. In other words, a bullish inverse fair value gap indicates the losing strength of sellers and an initial shift in the momentum towards the buy side. And there is a reason why I say this. You see, a bearish fair value gap is also called a SIBI. It means there is a sell side imbalance and a buy side inefficiency. It means that the sell side was offered but the buy side wasn't. So it is inefficient. Or simply put, it represents a fair value gap where bears have overpowered the bulls. It is also known as undervalued fair value gap. Now, in most of the cases, the price would increase in the future to balance this buy-side inefficiency. But when it comes to these bullish IFVGs, the price carried on higher despite balancing out the inefficiency associated with the bearish fair value gaps. This shows bullish intent. I have plotted some more examples of bullish IFVG and how it supports prices to move higher. You can pause the video and check this out if you want. Now, a bearish IFVG is just the opposite. So, a bearish inverse fair value gap is primarily a bullish fair value gap which fails to hold price and price breaks and closes below it. In this case, at first you have to look for a bullish fair value gap, and when price violates it by breaking and closing below it, it becomes a bearish inverse fair value gap. Here also, make sure that it is not just the wick projecting below, but the candle body has to completely close below the bullish fair value gap under consideration. Now, once your bearish inverse fair value gap is identified, it could act as an area of resistance for further price movements, and we can expect this resistance area to push price towards the downside. In other words, a bearish IFVG signals the dropping strength of buyers and an increasing strength of sellers. Now, just like the previous case, there is a reason why this happens. So, a bullish fair value gap is also known as a BC. BC stands for buy side imbalance and sell side inefficiency. This means that the buy side was offered but the sell side wasn't. So it is inefficient, or it represents a fair value gap where the bulls have overpowered the bears. It is also known as an overvalued fair value gap. It means that the price of the asset is higher than its fair value. Now, in most of the cases, the price might decrease in the future to balance this sell-side inefficiency. But when it comes to these bearish IFVGs, the price declined even lower despite balancing out the inefficiency associated with the bullish fair value gaps. Now, this shows strong bullish intent in the market. Now, here are some more real chart examples of bearish IFVG and how it acts as resistance for prices. Now, before I get to the next part, there is one concept that I need you to revise. It is the concept of consequent encroachment associated with the fair value gaps. Now, don't let the name scare you. The idea is very simple. Consequent encroachment is nothing but the 50% of the fair value gap. So, if I draw a Fibonacci retracement from this high of the first candle to this low of the third candle forming a bullish fair value gap, then the 50% level is the consequent encroachment level. Likewise, you can plot the 50% consequent encroachment level of a bearish fair value gap using a Fibonacci tool starting from the low of the first candle to the high of the third candle. Now, once you draw the consequent encroachment level for a fair value gap, you don't need to redraw it for an inverse fair value gap because the 50% level remains the same. This 50% level is very important when it comes to trading fair value gaps and inverse fair value gaps alike, because our trade entries, risk management, and reward to risk potential relies heavily on this level. Now, inverse fair value gaps can appear just about anywhere on the chart, and if you go after each and every single one of them as they appeared, you would end up losing a lot of money in the process. So, not all the inverse fair value gaps are worth our time and attention. So the next important thing you need to understand is how do you identify the high probability inversion fair value gaps, and when do you use the inverse fair value gap for your trades. Starting off, inversion fair value gaps that appear after sweeps of liquidity tend to have a higher chance of holding the price. The areas of liquidity that I'm talking about can be in the form of daily highs or lows, equal highs or lows, supports and resistance zones, or any lows and highs clearly sticking out with deep wicks. You also need to keep the larger market context in mind to make a good prediction of the high probability inverse fair value gaps. For instance, if you are on a bearish trend with lower highs and lower lows forming like this on your 15-minute time frame, the lower highs can serve as areas of liquidity that the price could sweep before continuing the bearish run. Now, move down to a lower time frame chart like 1 minute or 3 minute chart. Now look for an inverse fair value gap that gets formed when the price starts moving lower. Most probably, this could act as a resistance area for the further decline in prices. You could take trades from the consequent encroachment or at the lowest level of this bearish IFVG depending on your risk appetite. Now this could turn out to be a very profitable strategy if you combine it with the power of 3 or accumulation, manipulation, distribution setup. We will talk about this in our upcoming episodes. Another way to spot high probability inverse fair value gaps is to mark out premium and discount areas of price swings on your higher time frame chart. Now, as you may already know, in a bullish price leg or a bullish price swing, the discount zone is the lower half of the leg and the premium zone is the upper half of the swing above the equilibrium line. The idea behind premium and discount zones is that price will likely retrace at least to the 50% Fibonacci level during the pullback or corrective move before it continues in the ongoing trend direction. So during a bullish trend, any demand zone like a bullish fair value gap or a bullish order block within the discount zone is more likely to hold the price. Now, when the price taps into the demand area in the discount zone and starts moving higher, switch to your lower time frame chart and look for a bullish inverse fair value gap on the way up. This could be the first sign that the retracement is complete and that the trend is about to continue higher. Such IFVGs tend to be stronger in nature. You can use the consequent encroachment of this inverse fair value gap for taking your long trade entry by placing your stop loss just below the IFVG or below the lowest candle's wick based on how much risk you are willing to take. Yet another way to spot high probability inverse fair value gaps is during a failed market structure shift. It is very common for traders to switch into the lower time frame when the market reaches a higher time frame supply or demand level. These traders move down to their lower time frame structure and they try to catch a market structure shift on this lower time frame and then get into a trade on a fair value gap that gets formed during the market structure shift. Even though a fair value gap can be a good trade entry point, it can also act as a good inducement level for a further off supply or demand if it fails to hold the price. Now take a look at this case. The market came into a supply zone in the 4-hour time frame. In the lower 15 minutes time frame, we can see a market structure shift being formed with a fair value gap breaking lower. Now most traders would plan to take a short trade from this fair value gap, but instead of price respecting this fair value gap and moving lower, price violates this fair value gap and starts moving higher towards the nearby higher time frame liquidity zone. So this becomes a bullish inverse fair value gap that could support future price movements. You could use this inverse fair value gap to trade into the higher time frame liquidity zone. You can use the consequent encroachment of this inverse fair value gap for taking your long trade entries by placing your stop loss below the IFVG. So these are all the important things that you need to know about inverse fair value gaps.
We will discuss the most important concept in the whole smart money concept approach. Or maybe it is one of the keystone topics when it comes to trading as a whole. It is none other than liquidity. We retail traders like to get things done the easier way. Therefore, we usually focus on indicator signals for taking trades. We are least bothered about why the price moved in a particular manner that triggered the indicator to give a buy or a sell signal. Almost all indicators are derived from fundamental elements of the market, which are price and volume. Further, price and volumes are a result of the post-processing of basic market data. So the point that I want to elaborate is that indicators can to some extent do a good job in generating winning trades. But most indicators fail to work in all market conditions, and the signal provided by a single indicator cannot be trusted completely. And to top it all off, almost all indicators are lagging in nature and they give a trade signal after the move has already started, which result in more risk and thereby lowers your reward to risk ratio. So one way to stay on top of the market is to play the game like the market makers, big institutions or banks, or simply the smart money who feeds on the retailer orders to make a living. The big price moves or momentum moves that you witness in the market are a result of the smart money trapping the uninformed traders, or should I say the ill-informed traders, because retail education, as we all know, is based on patterns like candlestick patterns, chart patterns, trend lines, support resistance zones, etc. And eventually they hope on to taking trades on the signals given by conventional indicators or price patterns. I'm not saying that these patterns and indicators don't work at all, but there are high chances that most of these can be engineered by the big players. These big institutions or smart money are always trying to trap us and take our stop losses. So when new traders come fresh onto the markets, they can easily be manipulated and money can be taken away from them because they are easy prey for the big boys. The retail traders' lack of knowledge as to where the majority of market orders are accumulated makes them vulnerable to these institutional traps. This is the major reason why most of the retailers lose money. They remain as prey to these banks and institutions, or in other words, they are liquidity for the big players. In essence, this is a cat and mouse game. In order for one person to win, someone else needs to take a loss. So the question is, what do you want to be, the cat or the mouse? Now there is a popular saying in the market that if you don't know where the liquidity is, then you are the liquidity. So in this episode and the upcoming episode, we will talk extensively about this prime concept of liquidity to stay ahead of the majority of retailers and also to stay clear of most of the smart money traps. I can guarantee you that once you understand the entire concept of liquidity, you will think more clearly as to how the market functions, and it will also open up new trading possibilities for you. So let's get started right away. For some of you, there might still be this doubt as to what exactly is meant by liquidity. So in simple terms, a market with high liquidity is one where there is a large number of buyers and sellers willing to trade in that particular asset. This means that there is a high availability of buy and sell orders, allowing transactions to be executed quickly and with minimal impact on prices. So think of liquidity as an area where there is stop losses and pending orders waiting to be filled. We can find liquidity in areas or zones where many people place their stop losses, be it buy or sell stops. Usually, retail traders are impulsive and they tend to buy at highs when greed kicks in and they sell at lows when panic kicks in. But at all times, when there is a buyer in the market, there is always a seller and vice versa. And that's how the markets work. Now, the smart money, aka institutions, use this retailer liquidity, that is the orders of the retail traders against them. For example, the institution buys at lows when retail traders sell after a breakout of that low. Similarly, they sell at highs when the retail traders buy after the breakout of a high. So in essence, we are all liquidity in the market. However, that does not mean every single order which is being placed in the market must be targeted and taken out by these big players, as some areas are simply not liquid enough for it to be worth the grab for these institutions. So in short, liquidity is like fuel, or it acts as a driver to move the market in a specific price zone. Smart money will try to manipulate the price in order to break through these obvious zones and seize or absorb the liquidity. To sum it all up, every market has retail traders and institutions. The retail mindset is almost same across all the markets, and liquidity in smart money concepts enable us to understand where these retail traders are being manipulated and where the smart money is entering or exiting. Now, another question can pop up in your mind. Where to find these liquidity zones or order clusters? Now, there are two types of liquidity based on direction. They are buy-side liquidity and sell-side liquidity. The buy-side liquidity represents a level on the chart where the short sellers will have their stop loss positioned. So essentially, these stop loss orders set by the short sellers who sold from the resistance or the swing highs are essentially buy orders. And the buy-side liquidity will also include buy limit orders set by all those buyers who were waiting for a breakout above the resistance or the swing high. When it comes to sell-side liquidity, it is just the opposite. It represents a level on the chart where long bias traders will place their stop losses. So essentially, this cluster of orders will include stop loss orders set by buyers who went long from the support level or swing low level, which in turn is a sell order. And sell-side liquidity will also include sell limit orders which were set by those sellers who were anticipating a breakdown below the support or swing low. In both these cases, these levels are often found at or near extremes as the tops and bottoms of the ranges, meaning that these points are found at the highs and lows of ranges. This is because at these points, many people are waiting for the zone to act as a support or resistance, or for the price to break the zone to continue in its direction. So you can always use higher time frames like daily, weekly and monthly time frames to identify these zones. Now, if you want to understand where to find liquidity even simply, then understand that whenever there is a trend line, support or resistance level, double top or double bottom patterns, channel patterns, rectangular ranges, swing levels, etc., there are a lot of retail stop losses and pending orders available, meaning that there is enough liquidity to be taken. Therefore, these are popular areas where retail traders tend to execute their trades. So there will be a lot of stop losses, making it a nice level of liquidity for the big players to target. But before all that, let us understand why liquidity is important on a price chart. So if you think about it, liquidity is extremely important because it is the direction in which the price moves. The price will always move towards these points to attract liquidity to the market. Without liquidity, financial markets cannot function. Let me explain this so that you will have a better idea. See, big players in the markets aim for the best prices, but usually they face challenges finding sufficient counter orders to fill their large orders. For example, if an institution is looking for long positions, they will place buy orders at limit prices. But for the order to get executed, there needs to be enough sell orders, right? Now think about what happens if they enter the market at low liquidity areas where there are only fewer orders available to counter the institutional orders. This will create much more volatile markets, which will negatively impact the average price of the big players, which is actually a risk they are not willing to take. Now on the contrary, entering at a high liquidity area where there are a lot of counter orders available will result in less volatile markets, ensuring a better average price for the institutional position. And these high liquidity zones are where most of the retail orders are placed. Smart money players understand the nature of this concept and they will commonly accumulate or distribute their large positions near levels where many stop losses resides. This concept of absorbing retail orders by taking advantage of all available liquidity at multiple price levels is called as liquidity grab or liquidity sweep, and it comes from the need for big players to enter the market in these zones to take their large positions, and it ensures that their orders are filled at the best possible prices by breaking up their order into smaller sub-orders and then spreading them across multiple price levels. So institutional traders and high-frequency trading firms commonly use liquidity sweeps for efficient and quick execution of large trade volumes. And the sheer amount of stop-loss orders available at these key levels allows a large player to fully realize their positions. And once this level where many stop-losses have been placed has been traded through, it is often seen that the price will reverse its direction and head in the opposite direction, seeking liquidity at the opposite extreme. Now, think about the result when a large number of stop losses are triggered. If price experiences higher volatility or more orders hitting the market, such volatility in price generates opportunities for participants to either enter a trade in a favorable environment or protect their positions. The fact that too many orders were triggered all at once result in sharp price moves in the market. So without ample liquidity to play with, we will never see such big directional moves in the market. In fact, how will a car be able to move without fuel? Similarly, it is liquidity zones and liquidity sweeps that helps to run the markets smoothly. Now, I hope this clears things up. Next up, let's briefly touch upon the different types of liquidity areas within the market structure. Based on this, liquidity can be classified into external liquidity and internal liquidity. Now, as the name suggests, liquidity associated with major market structure is referred to as the external liquidity. It is also known as major liquidity, and the liquidity associated with minor or internal structures in the market is named as internal liquidity or minor liquidity. In this video, however, I will only talk about external liquidity and how to spot external liquidity. So to understand what external liquidity is, we need to have a fair understanding about market structure, predominantly the major market structure. I have already made a video on market structures and how to properly mark the swing points, namely the swing highs and lows, and also to identify and mark break of structure, change of character, etc. So if you haven't watched the video, I urge you to pause this video right away and watch the first episode of this course right now to get a better understanding as to how major liquidity functions. To briefly summarize things, a bullish market structure will have higher swing highs and higher swing lows. A higher high is confirmed only after a valid pullback and a higher swing low is confirmed only after a valid breakout structure. And a change of character happens when the price break and close below the previous swing high or higher high, thereby shifting the market sentiment towards bearishness. Now, when it comes to a bearish market structure, it comprises of lower swing highs and lower swing lows. A lower high is only confirmed after a breakout structure, and a lower low is confirmed only after a valid pullback. And a bullish change of character happens when price manages to break and close above the previous swing high or lower high, indicating a shift in the sentiment from bearish to bullish. Now, these are basically the things that you need to keep in mind while learning the major market structures. Now, let me ask you, which are the most important points when it comes to major structure? Quite clearly, these points are higher highs and lows and lower highs and lower lows, or simply these are the major swing highs and major swing lows. Now let me ask you another question. Why do you think the market does a breakout structure or a change of character and then does a pullback? What do you think about this particular behavior of the market? Okay, let me explain. Let's take the case of a bullish breakout structure and a bearish change of character. Now, what are they? These are basically simple breakouts, right? But if you think about it on a much deeper level, what exactly is taking place here? As we are aware, a bullish breakout structure happens when price breaks and closes above the previous swing high or higher high. So one must focus on the swing high level. The swing high is considered as a strong resistance level or a supply zone. There can be at least two types of participants waiting in this area. The former would be sellers, who are obviously trying to take short trades from the swing high or the so-called potential resistance level. And where will they put their stop losses? Quite obviously, they will set their stop losses, which is actually a buyback order above the swing high. Now, the second group involves buyers who are anticipating a breakout of prices above the swing high level because the current market trend is bullish. So, what will these buyers do? They will look to buy on the breakout and they will place their stop loss, which is a sell order, just somewhere below the swing high level. So as you can see, there is a large cluster of orders available above and below the swing high level. So this is a highly liquid area. So now what will happen? Depending on which side has majority of orders, the market will move in that direction to absorb or sweep the liquidity. In this case, a breakout above the swing high has happened, meaning that the concentration of buy order was much more than the amount of sell orders available below this level. This is why the market moved higher, absorbing all the seller stop losses and buy limit orders. A similar scenario takes place in case of a bearish change of character. Which is our level of interest in this case? Yes, you are right. It is the higher low or simply the swing low level. Now, applying the same logic here also, there are at least two interested players here. The former are buyers, since the swing low has the potential to act as a support or demand level, and since the trend is also bullish, the buyers will look to take long trades from this level. And where do you think they will set their stop losses? Quite obviously, they will set their stop losses, which mind you is actually a sell order, somewhere below the swing low level. Now, the second group comprises of those sellers who are looking for a breakout below this swing low level. Now, if you look carefully, you can see a proper trend line, and thus they will bet on the breakdown below the trend line as the price has tested the trend line multiple times. So they will look to sell on the breakdown, and they will obviously place their stop loss somewhere above the swing low or even above the recent swing high. So quite clearly, there are a large number of orders available above and below the swing low level. So this is a highly liquid area. Now what will happen? Depending on which side has majority of orders, the market will move in that particular direction to absorb or sweep the liquidity. In this case, a breakdown below the swing low has happened, meaning that the concentration of sell orders was much more than the amount of buy orders available above this level. This is why the market moved lower, absorbing all the buy stop losses and sell limit orders. I hope you have understood. In a similar manner, you can understand what happens during a bearish break of structure or a bullish change of character. Now, I hope things are making sense. But still, a question remains. Why don't the market just keep going in the direction of the breakout? Why do price stop and return back or why do prices form pullbacks? So if you have observed closely, once the price does a break of structure or a change of character, it does not move up or move down indefinitely. If we take the case of a bullish break of structure above this previous swing high, we will come to know that the price will move up only to that extent where the orders are available. Or in other words, as long as liquidity is available above the swing high, the market will move higher. This is because the smart money is absorbing all the buy-side liquidity so as to sell high. And once it has absorbed all the orders above this swing high, where do you think the market will go? Now, one thing that you must keep in mind is that the market moves from one area of liquidity to the other. So based on this idea, where will the market find liquidity once it has swept all the orders above the previous swing high, or once the buy-side liquidity is completely taken out? Think about it. There is no liquidity available anywhere higher, so no point in going higher. So where will the market go now? This is where we have to think about why the market does pullbacks after a break of structure or even a change of character. I can just tell you that it is the inherent nature of the market to move as waves, forming impulse and corrective moves, and just stop the discussion. But understanding the reason behind these pullbacks are very important. Let me remind you that the market needs fuel to move higher or lower. This fuel is none other than liquidity in the form of retailer buy or sell orders, as you may already know. Now, liquidity is the reason why market forms impulses and corrections. In this case, after sweeping out the buy limit orders and buy stops, which is actually the buy side liquidity, the market pullbacks lower. And what is the purpose of this pullback? The pullback is the way in which the market is looking for a sell side liquidity. And where can we find these clusters of sell limit orders and sell stops? This is why you need to have a proper understanding of how the market structure forms and functions. In this particular case, after a bullish break of structure, the market can pull back to a few possible levels where it could find liquidity. And only after it has tapped the liquidity from these levels, the market will continue to move higher. These levels could either be internal or minor swings formed within a wave, or it could be the major swing low also. Below these minor swings and major swing low levels, there will be a lot of players looking for a trade opportunity. Usually, the previous major swing low level is considered to be a strong demand zone or a support level. So most buyers would be interested to take a long trade from this level, and they will obviously set their stop losses below this major swing low level. So there will be a lot of sell orders available below this level, and so the market could tap into this liquidity pool to sweep all the retailer stop losses to buy at lower prices and then move up higher. Now the price won't always move all the way down to this major swing low. If you look at the chart, on most occasions, the price will pull back only by 40% or 50% before resuming the main trend. Now what do you think is the main reason for this? Now I want you to understand that when price pulls back, it has got a few liquidity options to tap into. I have not discussed some of these terms yet, but bear with me on this. So the first option is to tap into an inducement level, which you can consider as a previous minor swing below which you can find liquidity, as traders will look to buy from this level assuming a double top formation, while some sellers will place sell limit orders anticipating a breakdown of prices. Now both this action will result in a pool of sell side liquidity that the smart money can tap into. The next available options are order blocks or point of interest. And just for the sake of understanding, assume POI as areas where large number of buy or sell orders are placed by institutions for the sake of buying low and selling high, and we can expect the market to reverse from these zones. So the market can tap into either of the two order blocks. The first is a decisional POI, which is usually formed after an inducement, and there is a 50% chance that the market will tap into this liquidity area and reverse higher. And the other order block is formed near the major swing low level, and it is usually called the extreme POI. So the other 50% chance is that this extreme POI will be tapped to absorb orders. The price will go deeper into these levels to absorb all the available orders. Usually, VSMC traders will take buy and sell trades from any of these three mentioned liquidity levels. We will talk about the concepts of inducements, order blocks, POI, etc. in our upcoming episodes. But I hope you have understood the overall concept behind external liquidity. Now let us briefly take a look at where to spot these external liquidity levels, or under which circumstances can we observe these levels. So as you may have already guessed, the major swing highs and major swing lows, especially on higher time frames, are high probability areas where we can find major liquidity. You can understand this using a simple example. You can mark the structure on a 1 minute time frame, which is a lower time frame, and then mark the structure on a 1 hour higher time frame. In which time frame do you think there will be more orders present near the swing highs and lows? Without much thinking, we can say that the higher time frame swing levels will have more liquidity in comparison to the 1 minute swing levels, meaning that there will be more meaningful price reactions on higher time frame structures. Another location to find major liquidity is where equal highs or equal lows are formed near the previous swing highs or swing lows respectively on a higher time frame. There are good chances of finding sell-side liquidity below these equal lows and buy-side liquidity above these equal highs. The same logic applies to double tops and double bottoms, which are formed near these major swing points. Yet another location where you can find major liquidity is below an uptrend line drawn connecting the major swing lows, or above a downtrend line drawn connecting major swing lows. These trend lines are quite lucrative places because you can find both buy and sell side liquidity, because one party is looking to benefit from a breakout of the trend line while the other party is looking to gain from a reversal from the trend line. Obviously, the smart money will target these trend lines, and most often you can see fakeouts from these trend lines, which are none other than the big players sweeping the liquidity to get better entry prices. Now, the other important locations where you can spot major liquidity includes the previous monthly highs and lows, previous yearly highs and lows, previous weekly highs and lows, and even the previous daily highs and lows. These are all levels that a large number of participants are keenly watching to take a trade, and therefore there will be a large number of orders getting accumulated here. These are all prospective locations with very high liquidity. Since we don't have the kind of information that the big players possesses, we cannot determine the strength of a liquidity area and the exact location of liquidity at all times. Therefore, we can only predict where the liquidity can be discovered. But you must understand that the larger the time frame, the greater the liquidity. However, the more we go down onto smaller time frames, the more weak the liquidity will be. So these are all the things that you need to know about liquidity, especially external liquidity.
Are you one of those traders who gets into a trade near a level of importance, or be it a peculiar chart formation, but the price goes against your trade, takes out your stop loss, and the next thing you see, the price reverses its direction and moves in the same direction as you have anticipated in the beginning? I have been there, and it's very frustrating. And if you are one of them, then this video is for you. This video will definitely change the outlook of how you look at the charts. In the previous episode, we have talked in detail about liquidity, its importance, and we have also discussed in detail as to how major liquidity functions and where to find them. So, if you haven't watched that video, please make sure to watch it right away, because it will give you all the basic stuff that you need to know when it comes to the concept of liquidity. But just to brush things up, liquidity is generally known as the fuel in the market, which is usually a cluster of retailer orders. That is, it can be limit orders and stop loss orders, which, when taken out or swept, causes the market to usually reverse in the direction of the existing market trend with a strong momentum. This will usually result in a fake breakout of the previous high or the previous low, which can be in the form of deep wicks taking out retailer orders. This is called as liquidity grab or liquidity sweep. Now, market always moves from one area of liquidity to another. So when liquidity is taken, the market needs to generate liquidity in order to move, which means if liquidity isn't already there, it will be created. And we have also talked about buy side and sell side liquidity. Then we have discussed about major or external liquidity, which in short is the liquidity available at or near the major market structure, which includes the major swing highs and major swing lows. You will get a good idea on market structures if you watch my video on the same topic on episode 1 of this course. In addition to this, major liquidity can also be found at or near higher time frame supports and resistances, weekly or daily highs and lows, etc. Now, in the previous episode on liquidity, I have classified liquidity based on market structure as internal and external liquidity. But looking at a much broader perspective, we can categorize liquidity into four types, of which the later two of them are actually applicable to the previous two classifications. I will explain this right now. But first of all, the different types of liquidity classifications are external liquidity, internal liquidity, static liquidity, and dynamic liquidity. As mentioned just now, external liquidity is the liquidity that can be identified above a range high or a range low, previous high or a previous low, or swing high or swing low. Internal liquidity, on the other hand, is the liquidity created within a range high and range low, previous high and previous low, or a swing high or a swing low. Now, when it comes to static liquidity, this liquidity is created or it is identified at or near double bottoms or double tops, or simply near equal highs or equal lows. And finally, dynamic liquidity is actually identified as the liquidity which is associated with a trend line. So, this liquidity is created at both sides of a trend, that is, above and below a trend line. Now, you might have understood how the last two types of liquidity, namely the static and dynamic liquidity, are related to the first two types. It is simply the fact that trendline liquidity and liquidity associated with equal highs or lows, or simply the double tops and double bottoms, are observable in both major and minor structures in the market. Now, we will understand about internal liquidity, how to read it or how to spot it, and how retail people get trapped in these areas. As you may know, minor liquidity is the liquidity associated with the internal market structures. This means all the clusters of retail orders which are getting accumulated between the major market levels, like the major swing highs or the major swing lows, are known as internal liquidity. So you can anticipate a lot of retail stop losses and limit orders at or near these minor swing structures. In the screen, you can see a few structures. These are all common areas where you can spot internal liquidity. We will first understand each one of them and then take a few examples from real charts. This is not a very difficult topic to understand. All you need to do is to think how a retail trader will respond when provided with a particular situation in charts. So, all you have to do is to think like you always have as a retailer, and without much efforts, you will be able to identify where the minor liquidity is already available. In the first diagram, we can easily spot equal lows. So technically, we have two lows on the same price level, thereby forming a minor support level. It is also known as double bottoms. We have learned that double bottoms are reversal patterns, right? So what do you think a retail trader will do when he or she spots a double bottom pattern? It is very obvious that they will try to take a long trade either after a breakout above the neckline, or some might even take a long position from the support level connecting the lows. Now comes the important question: where will they set their stop losses? Almost all of them will place their stop losses somewhere below the support level. Now you can imagine that there will be a large cluster of stop loss orders lying below this support level. These are all stop loss orders set by the buyers who have taken a long position, and these stop losses are sell orders or sell side liquidity. But what exactly do you think this is? This, my friend, is retail liquidity that we have been searching for. Now, what happens next? Or what will be the outcome? The smart money will always look to buy at lower prices and they will look to sell at higher valuations. They do not follow any strategy or patterns, but they take their positions based on liquidity. So, most often or not, they will look to tap into these areas of liquidity to execute their positions at the best possible valuations. Now, coming back to a discussion on double bottoms, the smart money or institutions will push the prices down and break below the equal lows or support level so as to absorb all the sell side liquidity. And once all the stop losses are absorbed or swept, the market usually reverses its direction and move higher. This is usually more frustrating for traders than hitting the stop losses, because usually such a move will impact a trader's psychology and it will also question his analysis and learnings. So in short, there is liquidity below equal lows or below the support level connecting the lows of the double bottom, which is actually a cluster of sell stop loss orders or sell side liquidity which gets tapped by the big institutions to buy at lower valuations. Now, the second diagram shows equal highs. It means that we have two high points on the same price level. This is also known as a double top pattern. Like a double bottom, this is also a common reversal pattern that you can find on charts. If you have clearly understood how liquidity and retailer mindsets works in case of a double bottom, then understanding the logic behind double tops or equal highs is just a piece of cake. Ask yourselves, what will a retailer do when they spot a double top pattern? They will try to take a short trade, either after a breakdown below the neckline, or they might even sell when the price starts falling from the top resistance level connecting both the tops. Now, where will they set their stop losses? Most commonly, retailers will place their stop losses somewhere above the top resistance level. Now you can imagine that there will be a large cluster of stop losses lying above this resistance, and almost all these stop losses are placed by short sellers who sold from the resistance or neckline. So technically, this cluster of stop losses are buyback orders or buy side liquidity, and this is the liquidity that smart money is keen to tap into. So, what do you think will happen next? Smart money will always look to sell at higher valuations, and they will try to collect the retailer buy stop loss orders or the buy side liquidity which is clustered above the double top or the top resistance level. So, most often they will push the prices higher and break above the equal highs or resistance so as to absorb all the retail orders to sell their positions at the best possible prices. And once all the stop losses are grabbed or swept, the market will usually reverse its direction and move lower, which can be really heartbreaking. Now, if you have understood both these types of liquidity, then the next few types are going to be really easy. Yes, we are talking about support and resistance liquidity next. So, what happens in a support level? Think about it in terms of a retailer. What will be a retail participant's thought process? So, when price test a support level few times, we can anticipate two types of market participants around this area. The first group involves buyers who are looking to take a long position at or above the support level to take a reversal trade. The second group are sellers who are looking to profit from a breakdown below the support level. Now, how will both of these players act in this scenario? First up are the buyers. They are looking to take a long trade entry, so they will try to buy at or above the support level and they will place either buy limit orders or market orders. Now comes the important question, where will they place their stop loss? They will set their stop loss somewhere below this support level, which is actually a sell order. And when it comes to short sellers, they are looking for a breakdown below the support level. So they will either place a sell limit order or a sell market order at or below the support level when the breakout happens. And these guys will set their stop loss somewhere above the support level, which is actually a buyback order. Now, as you can visualize, there are a large clusters of buy and sell orders getting accumulated above and below the support level. Or in other words, there is sell side liquidity or clusters of sell orders below the support and buy side liquidity or clusters of buy orders above the support level. And this is a golden opportunity for the smart traders to capitalize on. So, what do you think will their action plan be? You might have seen and experienced this happening many times in the chart. The smart money will first push the price below the support level to break into the sell side liquidity so as to be able to execute their large buy order positions at the lowest price possible. This will result in retailer sell orders and sell stop losses being triggered. Now the buyer positions will automatically be exited when their stop losses gets hit, while the sellers are still in their trade and their buy stop losses are still active above the support level. Now once all the smart money orders are executed by the retail sell orders which was accumulated below the support, they will push the price higher. And what will happen now? Now all the buy stop orders which were set by the sellers will get triggered and they will also be out from their trades. This will lead to the market moving higher strongly. This will in turn induce the FOMO traders to start buying and thereby pushing the markets even higher. This is a typical case of false breakout and liquidity grab in the market. And even now, a majority of retail traders are unaware of this smart money trap. The same action plan happens in the case of resistance levels also. Here also there are two players. There are sellers who look to take advantage of a reversal from the resistance level so as to initiate a short position at or below the resistance. They will set their stop losses somewhere above the resistance level. Then there are buyers who are looking to benefit from a breakout above the resistance so as to buy above the resistance. These guys will set their stop losses below the resistance in the event of a breakout. So there is buy side liquidity above the resistance and sell side liquidity below it. And as you might have guessed, the smart money will try to manipulate both these players. They will first push the price above the resistance so as to execute their sell orders at higher valuations by absorbing the buy orders or buy stop loss orders, thereby taking out the short sellers out of their trades. But the breakout buyers are still active in their trades and their stop loss orders are still live below the resistance level. Or, in other words, the sell side liquidity is still available below the resistance. And once all the large smart money positions are filled, they will push the prices lower, thereby absorbing the sell side liquidity and taking out the breakout buyers. This will cause the price to fall rapidly, which will encourage the FOMO participants to start selling and thereby causing the market to decline even lower. This is another typical case of false breakout associated with a liquidity grab. A similar approach is seen during consolidations, especially the rectangular ranges. When it comes to rectangle patterns, we have a bottom support level and a top resistance level. So, most often, the false breakout happens in the opposite direction of the market trend. For instance, if the market structure is bullish, then most probably we might see price absorbing the retail liquidity available below the bottom support level and then push higher to form a real breakout above the resistance level. On the contrary, if the market structure is bearish, then most probably we might see a false breakout above the top resistance level so as to absorb all the buy side liquidity, and then the price might move lower and form a real breakdown below the support level. Now, this analysis is not 100% accurate because we cannot predict the occurrence of a false breakout perfectly. Since there is liquidity available on both sides of support and resistance, it can lead to more than one fake outs. Or in some cases, there might not even be a fake out. Now, let's talk about the next category of internal liquidity, which is the trend line liquidity. Now, trend line liquidity is one of the most common types of smart money manipulations that you can encounter on charts, especially when there is a predominant trend involved. Technically, there are two types of trend lines: uptrend lines and downtrend lines. Another important thing to keep in mind is that for a line to be considered as a trend line, there should be at least two touches on it. And to confirm a valid trend line, there needs to be at least three touches on it. Now, this concept is easy to understand if we compare it to support and resistance. So, consider the uptrend line as a support level for prices and downtrend line as a resistance level for prices. Now, it is easier to visualize the events better. So, let's start with an uptrend line. As I have mentioned, an uptrend line acts as a support for prices. So we can expect two types of participants waiting to take a position. There are buyers looking to go long from the support trend line. Then there are those short sellers searching for a breakdown below the support trend line. Thus, there lies buy side liquidity above the uptrend line and sell side liquidity below the trend line. This means most often both retail buyers and sellers stand to lose their stop losses. The big institutions will first push the prices down to break below the uptrend line. This means all the sell stop orders of buyers and sell limit orders of short sellers will be triggered. The smart money will try to absorb all the retail liquidity to ensure that their large buy positions are executed at the lowest prices possible. Now, only the short sellers are active in their positions with their buy stop losses live above the trend line. Once all the smart money orders are filled, they will take the prices higher, revisiting the buyback orders placed above the support trend line. By doing so, The short sellers will also be taken out of their positions once their stop losses are triggered. This will in turn push the prices higher. So you can see how both retail sellers and buyers are equally affected by such a manipulation. A similar scenario persists when it comes to downtrend lines also. There will be buy side liquidity above the resistance trend line and sell side liquidity below it. The smart money will create a false breakout above the trend line, sweeping all the buy side liquidity in order to execute their sell positions at the best possible valuation. And once all their orders are filled, they will reverse the prices to move lower, which then takes out the sell side liquidity, and then combine it with the new FOMO sellers coming in, the market will fall even more. Finally, there are people who look to trade prominent chart patterns like flag patterns, which unfortunately is yet another internal structure formation that is prone to liquidity manipulations. You might know about flag patterns, how it forms, and how to trade them. If you don't, you can watch it in my chart patterns course video. Basically, there are two types of flags: bullish flags and bearish flags. Let's start with the bullish flags first. Flags are continuation patterns, meaning that the possibility of the existing trend to continue is fairly high. When a bullish flag consolidation is spotted, the retail traders will look for a bullish breakout above the top resistance line. Now, majority of this group includes buyers who are looking to take a breakout trade, and they will usually set their stop losses below the bottom support level. This is the usual practice. Now, the manipulation happening here is very exciting. First, the smart money will create a small reaction above the top resistance level of the flag. This minor reaction above the resistance will induce a lot of former retailers to take the bait. That is, they will think it is a breakout, and these traders would rush in and place their buy market orders and buy limit orders above the resistance in order to buy, and they will in turn set their stop losses below the bottom support level. But most probably, this reaction would be a false breakout to trap the retailers into taking a trade. Now, the price would move lower and break below the bottom support level, where lies a large clusters of sell side liquidity, and these institutions will ensure that all their buy orders are executed at the lowest prices possible. Sweeping the sell side liquidity means that all the buy stop losses are triggered and they are taken out of their trades. Now, what happens afterwards? Quite clearly, the market will bounce back higher, and this time creating a real breakout instead of a minor reaction. And once a strong breakout with high volume appears, more traders would join in and the prices would rise even higher. A similar scenario takes place in case of a bear flag, but here, instead of buyers, the FOMO sellers would get trapped. A bear flag, as you may already know, is a bearish continuation pattern, so most of the retailers would look for a breakdown of prices below the bottom support line so as to take a short trade position while setting the stop losses above the top resistance line. So the smart money will create a sudden price reaction below the support line, which will induce a lot of retailers to enter into short trades. This activity causes a lot of buy stop orders getting accumulated above the resistance line. This is actually buy side liquidity. And the market will create a false breakout and it will move higher to grab this liquidity in order for the smart money to execute their sell orders at higher prices. Now, almost all the buy stop loss orders above the resistance level will be triggered, and those traders will be taken out of their positions. And once all the smart money orders are executed, the market will once again reverse and move lower. And this time, the market will form a real breakdown below the flag support, to which more short sellers would respond by selling aggressively, and the market will fall even lower. Now, there are other patterns and other situations in the market where internal liquidity is available for the taking within the major structure. Some of them are symmetrical triangles, price channels, supply and demand zones, etc. But the ones that I have discussed here are the most important types, and it is more than enough to get a fair understanding as to where to find internal liquidity and how to find smart money traps associated with them. Now let's move on to a few quick examples of such internal liquidity manipulations in the real market conditions. Take a look at this chart. You can see price making equal lows. So clearly there is sell side liquidity below this level. And what happens next? As you can see, the market moves down and absorbs these clusters of orders, and then it reverses to go higher. Usually, when liquidity is absorbed, the price will move quite strongly. Moving on to example 2, what we have here is equal highs, and you know what that means. It means there is buy side liquidity available above this level. Now, the smart money are eager to manipulate or absorb these liquidity areas. And guess what happens? The price breaks into this liquidity area and sweeps out all the retailer orders above it. And then it moves down lower. This is a typical manipulation that you can find on charts on a regular basis. You can call it double tops or double bottoms also, but the logic remains the same. Now, example 3 is a support level within the major structure, and we have talked about how the manipulations takes place around a support level or a demand zone quite clearly. So there is buy side liquidity above it and sell side liquidity below it. And look what happens next. The market breaks below the support level, gets hold of the retailer stop losses, and then reverses and goes higher, taking out the buy side liquidity. This price manipulations affects both the players. Now this is example number 4, which is a resistance level within the external structure. Here also, you can anticipate retailer orders stacking above and below the resistance. So there is buy side liquidity above the level and sell side liquidity below it. And as you can see, the price broke above the resistance level to sweep the buy side liquidity. And once it is done, the market reversed its direction. And in the process, it takes out the sell side liquidity and moved lower. Now look at this case. An internal uptrend line has formed within the major structure. From what we have learned, there are both types of orders available above and below this trend line. And look what happened here. The price broke below the trend line, thereby taking out the sell side liquidity, and then it did a sharp reversal and moved higher. Now, yet another example is of a downtrend line which formed within the major structure. Here, the price made a false move higher to grab the retailer liquidity and then reverse lower to continue in the major trend direction. The next example is one of a flag formation. This is a bullish flag formation. And as you can see, the price made a false breakout or reaction below the support level just to absorb the liquidity available in the form of stop losses. And then the price broke above the flag and moved higher. This is a similar example, but this is a bear flag formation. Here you can see the market took out the liquidity above the top resistance line, and then the price returned and broke below the lower support and continued to decline. In this manner, using this simple logic, you can spot innumerable liquidity manipulations in the charts. It could even be in the form of recognizable patterns that most retailers are keen to trade from. So go ahead and look for such manipulations and liquidity grabs in the charts, and also try to understand what happens next. You will clearly understand how the price movements are engineered in the markets once we have a discussion on a few more topics like order flow, order blocks, and inducements.
I know most of you have a good idea about what liquidity is. You might know it as the fuel that drives the market. You might even know that market moves from one area of liquidity to another. But if your charts look something like this, filled with potential liquidity zones, then it could be a problem. Because first of all, there is a lot of noise and unwanted information in the charts. And secondly, you'll get confused as to which ones to target. So let's fix this. In this video, we will talk about liquidity pools and how to identify high probability liquidity pools. So without wasting any more time, let's get started. If you have followed the first season of the Smart Money course, then you will have a decent understanding about liquidity, that is both external and internal liquidity, and where to find them. Basically, liquidity refers to money available in the market. These are essentially unfilled retail limit orders and stop loss orders waiting to be executed. Now, liquidity pool, as you can imagine, refers to a pool of money or a cluster of limit and stop loss orders set by the retail traders waiting to be executed. Mostly, the retail traders buy or sell at market prices,
while the smart money buys below the market price and sells above the market price. In other words, they buy at a discount and sell at premiums. The big institutions try to take advantage of these liquidity pools, but not all liquidity pools are worth their time. As I have mentioned, liquidity pools are associated with money. Some liquidity pools have more money associated with them, while others have less money associated with them. This has to do with where the liquidity pool gets formed, which is none other than the location of the liquidity pool, and it also has to do with the time frame in which the liquidity zone is formed. So, the smart money targets different liquidity pools differently. They attack liquidity pools with more money aggressively, and they use the other liquidity pools with lesser money as a means to get to these larger pool of liquidity. From this, we can understand that a liquidity pool with more money associated with it is a high probability one. So these are the liquidity pools that we must focus on for our trades. Now, the question is, how can you identify such liquidity pools in the chart? But before that, let us try to identify a liquidity pool. The idea is simple. Think from the perspective of a retail trader who uses technical analysis or price action for his trades. Where do you think they will look to place buy or sell orders? And where do you think they will set their stop losses and target orders? You'll be shocked to notice that retail traders mainly trade near important areas of supply and demand, like support or resistance, swing highs or swing lows, equal highs or equal lows, from trend lines, etc. They enter into a breakout trade or they enter into a reversal trade near these levels. Either way, they will set their stop loss beyond these supply or demand areas or based upon a candlestick high or low. Now, the target orders, which are also limit orders, are usually placed at the nearest potential demand or supply area where the price can anticipate a resistance. Since a lot of unfilled and unexecuted orders are accumulated near these levels, and since money is associated with these areas, these are liquidity pools. For example, take a look at this impulse swing move. There is a swing high and a swing low formed. Most traders would look to buy above an old high after a breakout, and retailers would look to sell below an old low for a breakout trade. Now, if some traders have already bought from the old lows, anticipating a reversal, then they will most likely put their stop loss below the old low to limit their losses. And on the other hand, if some traders have already sold from an old high, anticipating a reversal, then they will probably put their buy stop orders above the old high. So the old highs have a pool of liquidity resting above them in the form of buy stop loss orders, and there are also the willing buyers with their buy limit orders placed, looking to buy after a breakout above the high. These clusters of buy limit orders and buy stop loss orders placed near the swing high is called buy side liquidity. On the contrary, the old swing lows have a pool of liquidity resting below them in form of sell stop loss orders, and there are also willing sellers with their sell limit orders placed, looking to go short after a breakout below the low. These clusters of sell limit orders and sell stop losses accumulated near the swing low is called sell side liquidity. Now, the same concept applies to other areas of liquidity also. Now, let's head back to determining high probability liquidity pools. As I have already mentioned, there are mainly two factors in play. First is the location of the liquidity formation, and the second one is the time frame. In terms of location, a liquidity pool formed near an external structure is high probability. This means major swing highs and lows or equal highs and lows formed on a major structure have high probability liquidity pools near them. In this case, the time frame doesn't matter. If you are analyzing the charts in the 15 minutes time frame, then the liquidity pools formed near the major swing highs and lows are high probability ones, while the liquidity pools formed near the internal structure formations like the equal highs and lows, order blocks, fair value gaps, liquidity voids, etc. are only low probability liquidity pools, which only aids in taking out the major liquidity. These usually act as intermediate stopping points in the market to continue towards these pools of liquidity where more money is accumulated. Now, take a look at this bullish structure marked. You can see that I have marked the higher swing highs and higher swing lows. The region near the swing highs consists of a buy-side liquidity pool. On the opposite, the area near the swing lows consists of a pool of sell-side liquidity. Now, why am I saying an area near the swing high and a low and not exactly saying above the swing high and below the swing low? This is because, according to ICT, liquidity starts from where the body of the swing high or swing low candle ends. So, for this swing high candle, the liquidity pool would start from the end of this body to anywhere above the swing high point. This is the reason why we could see rejections or price pushbacks happen way before the market comes close to the actual swing high level. But mostly the concentration of orders or liquidity or money would be available above the swing high. The same concept applies to the sell side liquidity available near the swing lows. So for this swing low candle, the liquidity pool would start from the end of this candle's body to anywhere below the swing low point. Now, the second factor is the time frame under consideration. A liquidity pool formed in a higher time frame market structure is much more high probability than a liquidity pool formed in a lower time frame structure. This is very self-explanatory. For example, take a look at this 15-minute time frame chart on your left and a 1-minute chart to your right. I have marked the important liquidity pools on both these charts. Now, which out of these two do you think the market will respect more? Quite obviously, the liquidity pools in the 15-minute chart. The reason is quite simple. The liquidity pools in the 15-minute chart is associated with more money behind it, as more traders would be interested in trading these levels. Therefore, they will place more limit orders and stop loss orders. I hope it is clear. But what is more powerful and extremely high probability is a confluence liquidity pool. The idea is simple. So, if a lower time frame liquidity pool overlaps with a higher time frame liquidity pool, then the chances of price returning to absorb this liquidity increases. Not only does the chances of a price visit becomes increasingly high, but also the trade entries can be refined by moving into the lower time frames. Now, the only remaining thing to be understood is how the smart money uses these liquidity pools to their benefit. So, these big institutions use these liquidity pools to fill their large positions. In fact, they use the buy-side liquidity available near the swing highs to sell at higher prices or at a premium. Likewise, they use the sell-side liquidity available near the swing lows to buy at lower prices or at a discount. They use these liquidity pools to manipulate retailers. Now, how they access liquidity and manipulate the retail players is a very interesting topic of discussion. Essentially, there are two ways in which they do this. It could be a sweep of liquidity or a run through liquidity. They will make use of minor liquidity pools to make this happen. Take a look at this impulse swing move. I have plotted liquidity pools using rectangles. All I want you to do is to determine which are the external and internal range liquidity. Pause the video, take a few seconds, and write down your answers in the comment section. Okay, this is the answer. If you have got all of them correctly, congrats. And if you are unable to answer correctly, don't worry, because in this video, we are going to learn exactly that. We will understand in detail what external and internal range liquidity is, and I will try to clear all the doubts you have on this topic. So without further ado, let's get started. Before you learn about anything in the market, you must be familiar with the reason why price movements happen in the market. You could simply say it's because of supply and demand, and you're right. But this is a very vague way of explaining it. You can't really use it to your advantage. Essentially, market price moves because of two main reasons. In fact, price does only two things in the market. It either seeks liquidity or offers fair value. In other words, Price looks to sweep the liquidity accumulated near the liquidity pools, or it tries to balance out the inefficiencies or imbalances associated with the fair value gaps or liquidity voids. This is what all market movements come down to. Now, this process, where price moves in search of a liquidity pool, is called draw on liquidity. It is based on the idea that institutions and smart money seek out liquidity to execute their large orders, often leading to price moving towards the external liquidity pools before reversing or continuing its trend. For instance, if there is a buy-side liquidity nearby, price will likely move up to grab this liquidity. Similarly, if there is a sell-side liquidity nearby, price will likely move down to grab this liquidity. So this draw on liquidity will help you understand the directional bias of prices. It lets you anticipate the upcoming movement of prices. It helps you predict where the price is likely to go next. This is where you need the help of external and internal range liquidity. In the previous episode on liquidity pools, I have given you a heads up on the two types of market liquidity. These are the external range liquidity and the internal range liquidity. External range liquidity, or ERL, is the liquidity associated with the major swing highs or lows, or the old swing highs or lows. Large pools of unfilled buy and sell orders are accumulated near these areas. Now, when talking about the internal range liquidity, or IRL, some confusions could arise. One group of SMC traders will only consider a fair value gap as an internal range liquidity. Even ICT himself follows the same. There is another group of SMC traders who considers all the possible internal liquidity pools as IRL. These includes regions near equal highs or lows, fair value gaps, order blocks, liquidity voids, etc., which are formed within the external swing highs and swing lows. As a matter of fact, I belong to the second group, and I have a very good reason to think so. I will explain the reason shortly. In the meantime, if you have a convincing reason that you could change my belief, the comment box is open for you. Now, let's take a few cases to understand this. In this first scenario, we have a price swing, and I have marked the swing high and swing low points. We all know that there is a pool of liquidity available near these external swing points. Precisely, there is buy-side liquidity near the swing high and sell-side liquidity near the swing low. Now, if you observe the price action, you could notice a price imbalance. Clearly, there is a gap between this candle's high and the third candle's low. This is nothing but a fair value gap. I hope you guys already know how to plot a fair value gap. If you don't, I suggest you watch it from the SMC Season 1 playlist. Now, remember what we have learned earlier on the reasons why prices move. It is either to seek liquidity or fill an imbalance. And as you can see, it was exactly what the market did. It retraced back to mitigate the fair value gap. And as a next step, price reversed and moved higher to draw on the buy-side liquidity available near the swing high. You can see how the price accessed the external liquidity pool and continued higher. While rallying higher, the market formed imbalances or fair value gaps. Now, what do you think will happen? Quite obviously, the market has only two options: seek liquidity or offer fair value. Let me mark the new swing high and swing low. Let me also plot the external liquidity pools near these swing points. I will also highlight the fair value gaps. Now, let's see what the market has done. You can observe that the price has retraced back and mitigated the inefficiency associated with the fair value gap, and again it reversed direction and started to move higher to draw on the buy-side liquidity available near the swing high level. Now, you can ask me a few logical questions. Why did the market only draw on the buy-side liquidity, and why did it not sweep the sell-side liquidity? Or why did the price reverse after mitigating the fair value gaps, and why did it not sweep the external liquidity pool near the swing lows? The answer to these questions has to do with the market structure. In this case, we have looked at a bullish market structure. During a bullish market, price is mostly drawn towards the buy-side liquidity pools. Especially during strong bullish market phases, you won't see prices retracing all the way down to sweep the swing lows. In such scenarios, the market would reverse after mitigating the imbalances or fair value gaps. But that doesn't mean it doesn't visit the sell-side liquidity. That's not true. There are multiple occasions where the price will retrace even deeper to draw on the sell-side liquidity and then reverse higher to draw on the buy-side liquidity. We will look at such cases next. Now consider this swing move. The price is in a bullish trend. I will now mark the external liquidity pools and imbalances. Let's see what the market does. The market retraced lower from the swing high and then it came down to mitigate the fair value gap. But instead of reacting and reversing from the fair value gap, the price pushed lower. If you observe closely, you will notice that there is an extreme order block available. The price mitigated the order block and then reversed direction and started moving higher to draw on the buy-side liquidity pool. In this scenario, you will notice that even though price came back to fill this imbalance, the market did not respect the fair value gap. Instead, it moved lower to collect the liquidity available in the extreme bullish order block before it reversed higher to seek the buy-side liquidity. Now take a look at another case. Here also, the market structure is bullish. In this situation, I have already marked the external liquidity pools near the swing highs and lows. I have also highlighted the fair value gap and order block. Let's see what the price does. The market started retracing lower and it filled the imbalance. But instead of reversing from the fair value gap, the price pushed lower. It is hoping to find liquidity elsewhere. It came down to this bullish order block and mitigated it. But it did not stop there. The price pushed below the order block, drawing into the sell-side liquidity available near the swing low. It has swept the sell-side liquidity and then started to reverse and move higher. This is quite evident from the deep rejection wick that went down hunting for liquidity below the lows. The price moved higher again and grabbed the buy-side liquidity available above the swing high. In this scenario, the market grabbed both the sell-side and buy-side liquidity areas. This is the foundation of another important concept named dealing ranges, which we will learn in the upcoming episodes. Now, what did you learn from these three cases? The first and foremost point is that price basically moves from external to internal and then internal to external range liquidity most of the time. So price, after taking the external range liquidity, moves towards the internal range liquidity to balance the fair value gap, and then again price moves to the external range liquidity, and this cycle continues. The second point is that price imbalances like fair value gaps or liquidity voids serve as an incentive for prices to return back and fill these price inefficiencies. They act like magnets, drawing the price towards them. This is why fair value gaps are considered as the most important internal range liquidity area. But this doesn't mean price will always respect these fair value gaps and reverse its direction. This brings us to the third point. There are occasions where price will fill the fair value gap completely or partially and reverse direction. But then there are other scenarios where the market would break past the fair value gap and search for liquidity elsewhere. These could be near order blocks, areas near equal highs or lows, etc. Now this is the reason why I have stated that I belong to the second group who also considers order blocks, equal highs or lows, etc. as internal range liquidity alongside fair value gaps or liquidity voids. But obviously, having an imbalance like a fair value gap or liquidity void is crucial. Think about it. If internal range liquidity is all about fair value gaps, then what is the purpose of having order blocks in the internal structure? It will be useless, right? I agree that order blocks are high probability decision areas, but considering them as internal range liquidity would do no harm. I hope things are making sense. But do let me know in the comment section your view about this. And finally, there are occasions where price will just run through all the fair value gaps, order blocks, etc., and sweep the external liquidity pool. The market is full of probabilities, and most likely you have come across such a candle sweeping through the external pool of liquidity and rejecting back and leaving behind a very deep wick. And from there, price might reverse direction and continue with the major trend. But at the end of all this, keep in mind that while trading, our main focus is on the external range liquidity because it lies within the major trend of the market, while the internal range liquidities are taken by the price retracements. So, if you are planning to trade using this idea, consider the following. First of all, you need to identify the major market structure in your higher time frame. It could be 15 minutes, 1 hour, or 1 day. Let's assume the market structure is bullish. Next up, you need to ask, where is the most obvious liquidity pool which the market could draw upon or target? For instance, if a major high is untested, price is likely to be drawn towards it. And in case if a large price imbalance exists, the price may fill it before reversing again. The overall idea is to trade in the direction of the liquidity draw until a sweep occurs. So once price sweeps the external liquidity and retraces, look for reversals at order blocks or fair value gaps. You could use candlestick rejection confirmations like pin bars, engulfing candles, etc. to time your trade entries. You could also refine your entries by moving on to your lower time frame charts. Take a look at this figure. Can you take a guess in which direction will the price move after breaking through this level? You don't have to be absolutely certain about it. Just tell me what is the most probable outcome. Will there be a continuation or a reversal after this structure break? Or look at this scenario. What do you think might happen after price breaks past this level? Will it continue the trend or will it reverse? Comment down your answers. And if you can also give reasons or logic to why you think so, then that would be absolutely great. Okay, now these are the answers to the questions. If you got both of them right, congrats. If not, don't worry, because this is one of those situations where most traders get confused. When price crosses a liquidity pool, these traders gets confused whether the price will continue or run in the direction of breakout, or will it reverse and form a purge or a sweep. So this is one of the most important aspect of trading, and the logic to why this happen lies in how liquidity is being used by the institutional players. By now, most of you will have a fair idea of what liquidity and liquidity pools are, what external and internal range liquidity are, how and where to find them. But in this episode, I will talk about how the big institutions use liquidity to manipulate and trap retail traders like you and me, inducing retailers to get into trades at the wrong locations and in the wrong directions. In fact, we are going to learn about two liquidity manipulations, namely liquidity sweep and liquidity run. I will help you understand what these are, how they are different from one another, and how you can take trades using these concepts so that you won't fall prey to these big players. So a liquidity sweep is a price move that targets a cluster of stop loss orders or pending orders at a key level, triggers them, and then quickly reverses direction. In simple price action terms, it is a deliberate stop hunt or fake breakout engineered by the big players to sweep or grab liquidity, which are nothing but buy or sell orders lying around any support or resistance or swing highs or lows. So when price sweeps buy-side liquidity above a prominent high or sweeps sell-side liquidity below a prominent low and then fails to hold and snap back, it indicates a liquidity sweep. This often results in what we call a bull trap or a bear trap, which lures breakout traders into taking a trade from a false price move before reversing. This sweep of liquidity provides the fuel for big institutions to enter large positions in the opposite direction with minimal slippages in prices. So, for us retail traders, liquidity sweeps are important because they reveal areas where major players are active, and it also helps us to avoid getting caught in false breakouts. A confirmed liquidity sweep will often give a high probability reversal signal that we can capitalize on. In other words, spotting a sweep in liquidity can give you a heads up that the market may soon move opposite to the breakout, as smart money just use those stop losses to position themselves in the market. Now let's talk about liquidity run. Basically, a liquidity run forms the opposite outcome of a liquidity sweep. A run in liquidity occurs when price breaks through a key level of liquidity and keeps going in the same direction instead of reversing. In a liquidity run, the breakout is genuine and it is driven by strong momentum because a large cluster of retail orders gets triggered, and as a result, it fuels a continued trend move rather than a reversal. This often happens when an important support or resistance or swing high or low is broken with a big imbalance candle, which is accompanied by strong volumes and a wide range that closes beyond the level, signaling that smart money is running the price in that breakout direction. Simply put, a liquidity run happens when the market continues to run after eating up liquidity, confirming a new leg in the trend. For example, breaking above a resistance or a swing high and rallying higher with no immediate pullback would be considered as a buy side liquidity run, while price breaking strongly below a support or a swing low and dropping even further is considered a sell side liquidity run. In price action terms, a liquidity run represents a real breakout. This concept matters for retail traders like you and me because it marks the start of a new trend or a continuation move. Once you recognize a liquidity run, you can join the momentum and trade in the trend direction. It gives us a clue that the market has enough strength and institutional backing to not just grab liquidity but also push price into a new price territory. Now, these are the basic ideas associated with a sweep and a run of liquidity. But there is more to this concept than what meets the eye. The hard part is not about understanding this concept. Instead, it is identifying these sweeps and runs in real market conditions. In fact, there are two main challenges that traders typically face with liquidity. The first is knowing which level is actually being targeted. And the second challenge is knowing whether the price is going to make a continuation move or a reversal, which involves an understanding of advanced market structure. In hindsight, everything would look easy, but anticipating a liquidity sweep or a run beforehand is what really matters. Now, the most important thing when it comes to figuring out if it's going to be a liquidity sweep or a liquidity run is your trend. You want to make sure you know the existing market trend. That is, whether the market structure is bullish or bearish. A very basic rule of thumb is that if it is an uptrend structure with higher swing highs and lows, and if we are looking at a swing high, then most probably we can expect a liquidity run of prices above the swing high and not really a liquidity sweep. That is, there are high chances that the price will continue higher. But if it's a bull trend and you're focusing on a swing low, then most probably you can expect a stop hunt or a liquidity sweep below this low, and there are good chances that the prices will reverse direction and move higher. Now, you can ask me, on what basis am I talking about this? Now, the logic behind this assumption is simple. It is based on the concept of strong and weak highs and lows. I have talked about this in the recap episode of this season of the course. Essentially, during a bullish market structure, the higher swing lows are considered as strong lows because price respect these swing lows on multiple occasions without breaking and closing below these lows. A higher low becomes a weak low only when the market changes character towards bearishness. Until and unless this market structure shift happens, price will respect or protect these higher lows. Sometimes price might sweep below these lows, and on other occasions, price won't even pull back deep enough to test these lows. And even if the market does completely change character, a lot of the time, price will pop back inside the range for a pullback. You will understand this in the next segment. Now, on the other hand, a higher swing high during a bull trend is considered as a weak high because most of the time the market will break through these highs to grab the buy side liquidity, thereby forming a break of structure. The only occasion where a higher high becomes a strong high is when price fails to break and close above the swing high, thereby not forming a valid bullish break of structure. Of course, prices could sweep through the high, but if the market fails to form a valid bullish structure break, then also the high is considered as a strong one. This could potentially be the beginning of a change of character or a shift in the market sentiment. Now, this will give you a basic framework to identify if you should expect a liquidity sweep or a run. But to predict a continuation or reversal with higher confidence, we need to make use of another important factor. But before that, let me quickly run through a bearish scenario. In a bearish market trend, price forms lower highs and lower lows. If we consider a lower swing low, most probably we can expect the market to break below this low and create a run of liquidity rather than a liquidity sweep. This is because on a bear trend, the swing lows are considered as weak lows and prices usually run through the sell side liquidity to continue the bearish trend. The swing low becomes a strong low if the price fails to break and close below it. Of course, price might sweep the liquidity below the low, but if it fails to form a valid bearish break of structure, then the low is still considered as a strong low. On the other hand, if you target a lower swing high on a bearish market structure, then most probably you can expect a liquidity sweep to happen. And there are high chances that the price will reverse direction and drop lower. The reason why this happens is because on a bear market, the swing highs are considered as strong highs. Usually, these highs are protected, and on most occasions, price won't even test these highs, and even if it retraces back higher, it might only sweep these levels. A lower swing high will become a weak high if the market breaks and closes above this high, forming a change of character or a market structure shift towards bullishness. This is the basic framework. Now let's improve upon it with the help of internal range liquidity. I hope you are already familiar with this topic from the previous episode. Anyways, here we have an uptrend, and we know this because the price has created a break of structure by pushing through the previous swing high. With this new bullish swing that was created, we can plot our current external range liquidity levels. But because we know that this market structure is currently in an uptrend, we should be expecting the price to target the upper buy side liquidity level. But in order to do this, price needs to find some kind of support that can create the next bullish leg. This is when we look within the previous swing leg for bullish internal range liquidity in the form of a bullish fair value gap. This is what the market can use as fuel to go and push through the buy side external range liquidity. Now you can ask me, why a bullish fair value gap and not an order block? The answer is in the question itself. You need an associated fair value gap to consider an order block as valid. In fact, a fair value gap represents a price imbalance in the market which attracts prices towards it. It's like a magnet and prices are drawn towards it. This is why fair value gaps are the most crucial of all internal range liquidities. The market could also mitigate an order block, but the point is that there should be a fair value gap close by. That's the whole idea. So what we have just seen happen is the market has used the internal range liquidity to push through the external range liquidity level, and this has now given us a new swing with its own external range liquidity levels. If we are expecting the price to continue this uptrend, we should again look within this swing to find a bullish fair value gap or an associated order block that can be used as a support to create the next leg up. So in short, during an uptrend, we expect to see the impulse price moves that leave behind internal range liquidity in the form of bullish fair value gaps or an associated bullish order block, that can be used in the future to push through the buy side external range liquidity to create new higher highs. Now, for downtrends, it's the same, but just reverse the concept. So, if we are expecting the price to break through the sell side external range liquidity levels to create a bearish structure break, we want to look within the previous impulse bearish swing move for internal range liquidity that can help progress the price move towards the downside in the form of a bearish fair value gap or an associated bearish order block. So this explains the relationship on how price switches between the internal and external range liquidities. It's vital to always keep in mind when you see an internal range liquidity like a fair value gap or an associated order block get disrespected, it could be an indication that the market is wanting to attack the change of character level, which could result in either a liquidity sweep or a complete market structure shift. Now, with a clear understanding on how the market interacts, let's get back to business. As I have mentioned countless times, when price attacks an external range liquidity, which could either be a previous swing high or a previous swing low, it can do one of two things. The first option is for the market to continue in the same direction, which we already know as liquidity run. The second option is to create a reversal, which is called a liquidity sweep. So let's learn how to track liquidity runs with higher accuracy. So here we have an uptrend structure. This is a bullish price swing. I have marked the swing high and low. In this scenario, it is the swing high which is the current external range liquidity that we are drawing into. We can see price pushes into this swing high level and it closes above the level. But as of now, we can't yet consider this as a liquidity run. It has only created a breakout. It could just be a sweep also. Since the structure is bullish, the chances of this being a liquidity run is very high. Yet, we need additional confirmation. What we are looking for is an additional candle to form after this breakout candle that creates a fair value gap that overlaps with the breakout of the external range liquidity. The reason why this is required is because in order for the bullish move to continue, it needs to create an internal range liquidity which it can use as support during the next retracement. Likewise, if the market were to create this bullish fair value gap above the swing high level, then this is also a valid set. The important thing in this is that the internal range liquidity should be created during or after the breakout because the fair value gap formation represents bullish strength of the buyers by creating an area of imbalance that they can use as support for the next price rally towards the upside. However, if such a bullish fair value gap was created before breakout, we cannot use it for validation of a run-on liquidity. In such a situation, we have to wait and see if the chart creates the correct internal range liquidity that favors a trend continuation. So fair value formations like this don't give a strong confidence for liquidity run. Now, for liquidity runs on the sell side, we can use the exact same principles but just reverse them. In this case, our focus is on the swing low levels, anticipating a bearish structure break to attack the sell side liquidity. This means we are looking for the creation of a bearish fair value gap either within the break of the liquidity level or underneath it. We don't want to consider the bearish fair value gaps that are formed above the swing low level for the very reason that prices might retrace higher after sweeping through the sell side liquidity to fill the price imbalance, leading to a fake out. Now let's talk about how to anticipate liquidity sweeps. We will revisit a bullish structure. Here we have a swing high as our draw on liquidity. But this time, when price attacks the swing high level after retracing to an internal range liquidity, it fails to push over the swing level and close above it. So a bullish breakout structure has not happened. This shows a massive weakness in the buyer's effort to break through the high, creating what we know as a fake out, which is a clear indication that the price is creating a liquidity sweep. From here, we can expect to see a reversal in prices and possibly a change of character towards bearishness. Now, even if we consider a case where the bullish candle does close over the external swing high liquidity level, It doesn't mean we can eliminate the chance of a liquidity sweep. Here we have to focus on where the fair value gap gets formed. In this scenario, if we look at where the last bullish fair value gap was formed, we can see that it's below the external range liquidity. So if the price were to move down after sweeping the buy side liquidity, there is a high chance that this fair value gap will be completely disrespected, which would in turn give us a signal that the market structure could be switching. But even with that being said, we don't want to consider taking short trades just yet. Ideally, we want to see if the price will push down and break and close below the previous swing low, because this could create a bearish change of character, which is actually the second signal we require. So the first signal is the liquidity sweep above the swing high itself, and the second signal is the market structure shift. But the final confirmation that we are looking for is whether this bearish decline in prices managed to create a bearish fair value gap during or after the breakdown or change of character below the low. This is important because this is what sellers can use as resistance to continue the downward move, thereby creating a new breakout structure which confirms that the market has now transitioned into a bearish trend. This is the typical setup that we usually tend to see when the market creates a liquidity sweep. But focus on the fact that despite a liquidity sweep or run, we should always trade in the direction of the existing trend. If the existing trend changes, change your directional bias. Now let's look at a top-down approach that you can use for your trade setups. Let's look at a bullish structure with a fair value gap on a 15-minute chart. So if you are analyzing your charts on a 15 minutes higher time frame and you have a fair value gap, then you should move down into a smaller time frame like 1 minute or 3 minute to analyze whether the market actually respects this 15-minute fair value gap. So here we are looking at the same chart but on a 1 minute time frame, and as expected, we can see the current market structure on this lower time frame chart is bearish, which we can confirm with this breakout structure. But remember, we want to enter a long trade. So what we are looking for is a reversal on this 1 minute time frame so that it aligns with the bullish 15-minute chart. When we mark out the current external range levels on this 1 minute chart, we can see a sweep of liquidity occur near the swing lows, which, as we know by now, is the first phase of reversal that we are looking for. Fast forward, we can then see a bearish fair value gap get disrespected, followed by a bullish change of character, which means all we are waiting for now is the bullish breakout structure to signal that the reversal is complete, which in this case didn't take long to happen. Now, when a reversal like this takes place, the first bullish fair value gap to form afterwards is what is commonly known in SMC as the silver bullet. This represents the highest probability fair value gap that the market can offer. We will learn more about this strategy later in this course. So this bullish fair value gap is what we will use to enter our long trades. And you could place your stop loss below the lowest point before the change of character happened. Now we can switch back to the 15-minute time frame with a good amount of confidence that this 15-minute bullish fair value gap will be respected based on the confirmation signal that we have received as 1 minute time frame trend reversal. From here, we want to see the price move higher to draw the buy side liquidity where we can plan to exit our trade. Or we could of course hold this trade for a longer period if we believe the market will continue in the bullish direction. We can make use of the overall structure analysis and see if price will perform a liquidity run based on whether it forms a structure breakout with associated fair value gap. This trading method applies to both liquidity sweeps and liquidity runs alike. So make sure you learn and implement it properly.
We are going to learn another important topic in SMC, without the knowledge of which trading in the markets can be tricky as well as risky. It is none other than inducements. Some traders ignore the significance of this topic, while many others don't use it in the proper manner. We will try to fix this. So in this video, we will understand what inducement is and what its significance is. Then we will learn different methods of identifying and spotting inducements in the market. Further, we will discuss about the different types of inducements, namely major and minor inducements. And finally, we will understand the difference between inducements and change of character. Now, there are different ways in which you can define an inducement, but I would like to think of inducements as an area or level where retail stop losses can be hunted, or simply think of it like a trap in the charts. The proper definition of inducement is that inducement is an area of deception where most traders believe it is the correct and right time to enter a trade, leading them to take wrong decisions at the wrong locations and in the wrong direction. So, the idea of an inducement level is to induce or persuade traders to buy or sell at the wrong location, thereby leading them to a trap. Now, inducement is a concept based on liquidity. For example, think of it like a level where retailers find an opportunity to take a trade. But for someone who follows smart money concepts, inducements give them an opportunity to take a counter trade against these retailers. Or in other words, inducements signal SMC traders that it is now feasible to take a trade. It is always advised that until and unless there is a proper inducement in the chart, one should not even think about entering into a trade position. This is because the chances of it being a trap otherwise is very high and you might end up in losses. So the reason why this is particularly important is because of the fact that inducement follows the nature of liquidity. So if you have noticed, liquidity follows an accumulation, manipulation, distribution cycle, also known as the power of 3. Let me explain this. Accumulation represents a stage within the market cycle where prices tend to consolidate while engineering liquidity on either side. The manipulation phase follows the accumulation and is often marked by sudden and sharp price movements that catch retailers off guard. Manipulation occurs in the opposite direction of the real move, and it is aimed to stop out the retailers and induce the breakout traders. So understanding the intentions behind manipulation phase is very crucial. Smart money uses these moves to acquire more shares or assets at favorable prices. By triggering stop losses and inducing breakout players, they generate enough liquidity for their positions. They accumulate positions while retail traders are caught on the wrong side of the trade. Now comes the distribution phase. After accumulating at the best possible valuations and manipulating the market to their advantage, smart money begins to unload their positions to those eager retail traders who are late to the game. The distribution phase in SMC is quite a bit different from the distribution phase that we have learned in the price action course. Here, during distribution, the smart money slowly offloads their holdings, typically in a controlled manner. They distribute their shares to the retail traders who are jumping in, eager to open new positions at higher valuations. This influx can sustain the rally for a while. This AMD concept emphasizes that recognizing these phases is essential for successful trading. By understanding when smart money accumulates, manipulates, and distributes, traders can align themselves with the dominant forces rather than getting caught on the wrong side of things. So this is the whole concept behind inducements also. There are other significance of inducements which we will talk about in a short while. Now, how exactly can we find inducements in the charts? What are the things that we need to consider? So there are two methods which you can apply to find inducements, both of which has certain limitations of its own. These are the first pullback method and the trendline method. Let's talk about the first pullback method. This is actually the first pullback after a break of structure. The idea is quite simple. An inducement is considered as the first pullback after a valid break of structure has happened. These pullbacks are minor pullbacks or internal pullbacks, which can be formed using a single candle, a group of candles, or even a deep wick. You can see the different types of pullbacks that you can find on charts here. Even though we consider inducements as the first pullback after a valid break of structure, in certain scenarios, we might need to tweak this rule by a little bit. Let us understand this using a few examples. We will first consider some bullish market scenarios on a major market structure. Before that, make sure you have a fair understanding about the market structure mapping. You can watch that video in my SMC playlist. Anyways, here we have 4 situations. We will take a detailed look at each one of them. In the first case, we can see the price break and close above the previous major swing high. This is our valid break of structure. Now let us see what happened after the break of structure. You can notice how the price moved higher and then it formed a minor pullback. As per our definition, the low of this minor pullback is our inducement level. We can draw a small horizontal line at this low to mark the inducement. For easy identification of this line in the future, we can name this line as IDM, or you can even use a dollar sign for the same purpose. Now you can see what happened next. The price moved lower and break below this inducement line. This means that the liquidity below the inducement level has been absorbed, or the uninformed retail traders are trapped. Only when the inducement level is taken out should we start thinking about a trade. Mostly, the market will move in the direction of the existing market trend after taking out the inducement. But this does not have to happen immediately. The price can reverse after sweeping a liquidity area, or it can reverse from an order block also. So inducement is a useful concept before taking a continuation trade. But as always, this cannot be said with 100% accuracy. There can be such instances where the market could just fall lower and break below the major swing low and thereby forming a change of character instead. Now moving on to the second example, in this case, we can observe that the price moved higher and it broke above the previous swing high level. But the price did not manage to close above the previous higher high, so this is not a valid breakout structure. Therefore, we cannot spot the inducement yet. And what happened afterwards? The price did manage to break and close above the previous major swing high level. So now we have a valid breakout structure. Now the price moved even higher and formed a minor pullback. Now we can mark the low of this pullback using a line. This is our inducement level, which is denoted by IDM or a dollar sign. But as you can see, the price did return back to take out the liquidity below this inducement level. Keep in mind that only after the inducement is taken out should we think about taking trades from an order block or from an area of liquidity. Inducement is also used as an order block filter. The idea is that inducement levels are considered as smart money traps because it induces retail traders to take a short trade from an inducement level which is above the price of interest or demand zone during a bullish market structure, thereby making them to trade in the wrong location as well as in the wrong direction. For those who are unaware of what price of interest is, POI or price of interest is a price level or a price zone where there is a very good probability that the market could react with it and respond accordingly. A POI is also called DP or decision point by some experts. So a POI can be any of the following. It could be an order flow, an order block, a supply or demand zone, session highs or lows, daily or weekly or yearly highs and lows, or it could even be price caps. In a similar manner, inducement persuades retail traders to enter into a long trade position from an inducement level, which is below a price of interest or a supply zone during a bearish market structure, thereby making them to trade in the wrong location and in the wrong direction. So most often or not, price will break this inducement level and take out the retailer liquidity. So this is a very common smart money trap. And this is why it is always recommended to take trades once the liquidity associated with an inducement level is taken out. Because once the price has swept the liquidity associated with an inducement level, there are good chances that the price can reverse without testing any price of interest or supply or demand zones. I hope things are making sense. Now look at this third example. Where is the inducement in this case? It is clear that the price did form a valid breakout structure, but as per our definition of inducement, the price did not create any minor pullbacks after the bullish breakout structure. But the price did form a pullback just before the breakout structure. So in such instances where there is no pullback formed after the breakout structure, we will consider the last minor pullback before the breakout structure as the inducement level. And we can mark it using a line and name it. Now look what happened next. The price did return all the way down and took out the liquidity below the inducement level. And then it moved higher. So this is a special case where we have to make adjustments and not blindly follow the textbook definition of inducements. Now take a good look at this last example. Here the price gave a clean breakout above the previous higher high. So it is a valid bullish breakout structure. Then the price moves higher and forms a minor pullback. So as per our rule, we will draw a line at the low of this pullback and mark it as our inducement. Now did the price return to grab the liquidity? No, the price did not come back. Instead, the market moved higher and then it formed another minor pullback. Now what will we do? If such a case takes place, we should shift one inducement level forward to the low of this newly formed pullback. And even if the price don't take out this new inducement level and it moves higher and then create another pullback, then without any doubt, we should shift our inducement line to this new low formed. This is yet another important concept in connection with the basic rule of first pullback. And as you can see, the price returned to sweep the liquidity below the inducement level, and then the market continued higher after absorbing all the liquidity. The idea remains same for bearish instances also. Let's quickly look at a few examples for bearish market structure. In the first example, price formed a valid breakout structure. Then it moved lower and made a minor pullback. So as per the rule, we can draw a line at the high of the pullback and mark it as the inducement level. The price did come back and sweep the liquidity above this line. Moving on to the second example, here the market did not give a valid breakout structure at first. Then price consolidated a bit and then finally it break and close below the previous swing low level, thereby forming a valid bearish breakout structure. And then once it moved lower, it formed a minor pullback. We can mark the high of this pullback as our inducement. Then we can see that the price returned to take out the liquidity above the inducement level. So an important point to be noted here is that you should never look for an inducement until there is a valid breakout structure. Now in this third example, the price created a valid bearish breakout structure, but the price did not form any minor pullback on the way down. Instead, it formed a corrective move towards the upside. In such cases, we can mark the high of the last pullback before the breakout structure as our valid inducement level. In this scenario, you can see how the price moved higher and took out the liquidity above our inducement level and then fell lower. In the last example, the market formed a minor pullback after a valid breakout structure. Then we can mark the high of this pullback as our inducement level. But the price declined even lower without grabbing the liquidity. Then it formed another minor pullback on the way down. In this case, we can shift our inducement line to the high of this newly formed pullback. And we can notice what has happened afterwards. The price swept the retailer liquidity above this inducement level. Now, let me remind you again that you should never think about taking a trade until and unless the inducement level is not taken out. This is mandatory if you are following smart money concepts. Now, always keep in mind that inducements should be marked on the impulse move that caused the breakout structure. It should not be marked on the corrective move like in this case. This is the wrong approach. The only exception is when the market forms a valid change of character, in which case the correction move gets converted into the impulse move of the counter trend. Take a look at this scenario. Here, the price break and close below the previous higher low level, thereby confirming a bearish change of character. In this instance, we have to look for inducements in the price move that has caused the change of character. In that sense, we have to mark the inducement at the high of the first minor pullback after the valid bearish change of character. So make sure you are marking your inducements in the right manner. Another importance of inducement is that it helps to identify and confirm the higher highs in a bullish market structure, and it helps to confirm the lower swing lows in case of a downward market structure. In the market structure mapping episode, I have mentioned that you need a deep pullback after a valid breakout structure to confirm your higher highs in case of a bullish trend, and also to confirm your lower swing lows in case of a bearish structure. I asked you to use Fibonacci retracements to identify deep pullbacks, but this is a time-consuming process. So a rather simple hack is just to identify the valid inducement level. Then the highest point above this inducement line, once its liquidity is taken out, will be our higher high in case of a bullish market structure. Similarly, the lowest point below the inducement level, once the liquidity above the inducement is grabbed, will be our lower swing low in case of a bearish market structure. Now let's talk about the second method of identifying and marking inducements, which is by using trend lines. The idea is very simple. Let us consider a bullish market scenario. Keep in mind, whatever happens, we will look for inducements only after a valid breakout structure. Here you can see how the price break and close above the previous higher high, thereby forming a valid bullish breakout structure. Then the market moved higher. What we will do is that we will draw a trend line connecting all the minor lows within the major swing. Or in other words, we will try to connect all the internal swing lows using a trend line, as you can see in this figure. Then we will wait for the price to break and close below the trend line, which will in turn induce retail traders to sell because of a trend line breakdown. All these retailers will be trapped and their orders will be taken out. Now, in a bearish market structure, we should look for a valid bearish breakout structure below the previous swing low level. And when the price falls lower, we can mark all internal highs formed after the recent swing high and then connect all these minor highs as and when they are formed. And when the price breaks and closes above this downward trend line, we can expect retail traders to take buy positions as they have spotted a trend line breakout. This is our inducement. All these retail traders will be trapped and their orders will be absorbed. Now, there are a few problems with this trend line method. First of all, trend lines are subjected to human errors. This means different traders would draw and interpret trend lines differently. So the inducement identification varies vastly from person to person. So this confusion is not a good thing. The second issue is that sometimes even after a breakout below the trend line, the price would not move below the inducement low, which means the liquidity below this level is not absorbed. This could lead to wrong analysis. Because as per our pullback method, the inducement level gets shifted to newly formed pullback lows as long as the liquidity is not swept by the market. So from my experience, it is better if you stick with the first pullback method after a valid breakout structure for marking your inducements. Now let us talk about major and minor inducements. You might have already guessed what these are. Anyways, the differentiating factor between the major and minor inducements are the time frames. It will also depend on your trading style. So if you are an intraday trader, then your higher time frame can be 15 minutes, while your lower time frame can be between 1 minute to 5 minutes. So if you were to map your market structure and mark your inducements on a 15-minute higher time frame, then you are indeed marking the major inducements. Now, if you start mapping the structure and mark all the inducements on a 5-minute lower time frame, and then consider all the internal price swings and the associated breakout structures, then you're drawing the minor inducements. On a similar note, if you are a swing trader, then your high time frame can be 1 day or 4 hours, whatever it may be, and your low time frame could be 1 hour. In this scenario, your major inducement is marked on your higher time frame major or external structure, while your minor inducement is marked on your lower time frame structure, which is 1 hour, and considering all the internal price moves within the major swing structure. Now, the idea of identifying and marking minor inducements are also the same as with major inducements. But because we are making use of lower time frames and also taking into consideration the minor or internal structure, we will be faced with a lot of minor structure breaks. This will result in a lot of inducements getting formed. These minor inducements can be helpful for those traders who wants to collect some quick profits while waiting for the price to take out the major inducement level. But there is a small change in concept when it comes to minor inducements and change of character in a lower time frame internal market structure. So let's clear that out. So this is a bullish market structure on a higher time frame, and to the right is how the lower time frame structure looks like. And as you can clearly see, in the lower time frame, the internal price swings are quite detailed and visible. Now let us mark the breakout structures in the minor time frame. Once the breakout structures are identified, let us find the proper inducements. We will try to mark the inducements as per the first pullback after the breakout structure rule. Now, since we have marked the bullish breakout structure, we will have to spot the lows of the first pullback. Here, I have marked all the lows of the pullback, and we can draw a line at these lows. These are our inducements. Now, we can see how the price reacted in these inducement levels. Now, let us focus our attention on this last inducement level before the market reversed lower. So before it reversed, the price tested a supply zone or a price of interest. So this is not really an inducement, but instead this is a change of character or chalk in the minor structure. So the simple difference between an inducement and a chalk in a minor structure on a lower time frame is that inducement is the first pullback after a valid breakout structure, but a chalk becomes that inducement level before the market tests a price of interest. Let us look at a bearish case also to help us understand the idea even better. So first, you need to go to your higher time frame and map the structure. That is, you need to find your lower highs, lower lows, breakout structures, and change of characters if any. Then you need to mark the major inducements in this higher time frame structure. So if you are an intraday trader, map your structure on the 15 minutes higher time frame. The next step is to move to your lower time frame, which can be between 1 minute and 5 minutes. Let's take 3 minutes for our purpose. In the 3 minutes chart, you will get more granular details on the internal structure and a lot more of swings. Now start identifying the valid minor breakout structures when the price break and close below the previous internal lows. Then start identifying the minor inducements, which are actually the highs of the first pullback after a valid minor breakout structure. Now this last inducement before the price reversed after testing a price of interest or a demand zone will be our change of character. So in the market, change of character can happen on two occasions. First of all, as you may already know, a chalk happens on a major market structure when the price breaks and close below the previous major swing low in case of a bullish market, resulting in a bearish change of character, or we can say there is a change of sentiment from bullish to bearish. It can also occur when price break and close above a previous major lower swing high level, resulting in a bullish change of character. The second scenario where a change of character can be identified is on a lower time frame internal structure where your inducement becomes a change of character when it tests a price of interest and reverses. I hope things are clear. We are going to learn two important topics in SMC. They are order flow and order blocks. These are related topics, so it makes sense to make a single comprehensive video on these topics so that we can learn how they are different from one another. Now let me warn you, this is going to be the longest video in this entire course. So watch it when you have adequate time because this is one of the most demanded smart money videos. In the previous episodes, we have discussed the concepts of liquidity in great detail, which is actually the core of SMC learning. And if you haven't watched these episodes, I strongly urge you to watch them right away. Now, a fair understanding on liquidity will give you a lot of insights into the ways which smart money institutions operate. But that is not enough to convert into profitable trade setups. For getting the best possible trades, you need to have a fair idea as to where to take the entries. This is where order flow and order block come into the equation. These are simple yet effective methods by which you can spot potential areas from which you can hop into a trade position with minimal risk and high chances of profits. So in this episode, we are going to start our discussion with order flow, how to identify an order flow in charts, what are the different types of order flows and how do they work. Then we will discuss about order blocks. Why is it important to have an order block? How to spot an order block, the different types of order blocks, and what are all the key points that you need to keep in mind. And we will also learn how to identify a valid order block. We will begin with the order flow. I have told you in the liquidity videos that market moves from one area of liquidity to the other. This can either be internal or minor liquidity or external or major liquidity. The market can tap into either of these liquidity areas or zones and then reverse the price direction after sweeping the retailer orders. In the charts, a lot of such liquidity areas are generated, and it is obvious that not all of them are worth considering, and only a few of them will provide us with high quality trade setups. So how are we going to capitalize on our knowledge in order to make highly probable and profitable trades while reducing the risk of overtrading or simply getting into trades at all these liquidity areas? This is where order flow and order blocks come into the picture. So think of an order flow as that price move in the chart which to most extent reveals where the smart money hides their positions or where they are most likely to initiate their positions. If you have observed the flow of prices in the market structure, you will notice that the price will not always tap into the external structure before reversing its direction. The market might reverse even before that. This is due to the existence of order flows. Technically, there are two types of order flows. These are bullish order flow formed during an upward market structure and a bearish order flow which is formed during a bearish market structure. I have said this many times, but I will say it again, that you need to have a good understanding as to how to mark the market structure properly in order to make the best use of these concepts. If you get your market structure mapping wrong, everything else will meet the same fate.
So make sure to watch the first episode if you haven't already. Now coming back to our discussion, let us consider a bullish market structure and try to spot the order flow. During a bullish market, the major price structure forms higher highs and higher lows. But if you observe the corrective moves, you will notice that it forms lower highs and lower lows. So a bullish order flow is represented by the last selling price before the bullish price momentum. Or in simple terms, the last selling move before the buy is called as the bullish order flow. Therefore, all you have to do is to identify the bearish candles before the price begins to move higher. This is how we spot bullish order flows in the charts. Let us now learn how to spot a bearish order flow. You will find bearish order flow in a bearish market structure. In a bear market, the major structure forms lower highs and lower lows, while the corrective moves forms higher highs and higher lows. And the bearish order flow is represented by the last buying price move before the ongoing bearish price momentum. Or in other words, the last buying move before the drop or sell is called as a bearish order flow. Therefore, you need to identify the bullish candles before the price begins to drop lower. But is the order flow that we have identified a valid one? This is a question which is very important to consider. Order flows can be classified into three types. These are mitigated order flows, unmitigated order flows, and failed order flows. Out of these three, only the unmitigated order flows are of any use to us. But for the sake of understanding, I will explain all of them. Basically, a mitigated order flow is one where the price has already tested or mitigated the order flow. Think of an order flow or even an order block as a one-time use thing. Once it is tested or mitigated, it is of no use to us anymore. It is not like our typical supports or resistances where the price will respect it multiple times. But this is not the case with order flows and order blocks. Check out this example. We have identified the last selling move before the buy. So technically, this area is an order flow. But if you notice closely, you will see that the price has tapped into the bullish order flow. Therefore, this bullish order flow is mitigated by prices. This means that the order flow will not work in the future. Look at another example, but this is for a bearish structure. We can spot the last buying move before the drop and mark this area as a bearish order flow. Then you will notice that the price has tapped into this order flow and therefore it is already mitigated. So this order flow will not work for the future price moves and it is not worth considering. The second type is unmitigated order flow. In this case, the price will not tap into the order flow or the price will not mitigate the order flow. These are the order flows which are useful to us. This is because there is a high probability that the price might return back to mitigate this order flow. Now we can take a few examples to understand this better. In this first case, the market is in a bullish trend. So during the corrective move, the price forms lower lows and lower highs. Our order flow will be the last selling move before the buy. Once we have marked the order flow, we can observe that the price has not tested or mitigated this bullish order flow. It also means that the price could come back to this order flow later to mitigate it. So this is an unmitigated order flow. Similarly, if we spot a bearish order flow in a bearish market structure and the order flow is not tested or mitigated by prices, then this is an unmitigated order flow zone, which could be a potential area of interest for a price reversal in the future. Now keep in mind that even the wicks projecting into an order flow zone mitigates it. So the tiniest of tiny details matter. Now what is a failed order flow? So it is an order flow which we have identified and marked through which the prices passes through. Just like a mitigated order flow, failed order flows are of no use to a trader. Another point to keep in mind is that once an order flow is mitigated, you can always shift towards the next one, and if the next one is also tested, then you can shift towards the next order flow and so on. Now, let us briefly look at how to take trades using the order flow concept. The idea is to take a trade from the order flow zone when price comes back to test the order flow during a pullback, which follows the breakout structure, and then take a trade entry when the price begins to reverse from the order flow after mitigation. As I have mentioned a few times, this should only be applied to unmitigated order flows. If you know how to correctly mark the market structure and identify the pullbacks, then this is going to be very easy. Now let us consider an example for bullish and bearish scenarios. This is a bullish market structure. Here you can see that the price has created a bullish breakout structure when it broke above the previous major swing high. we can identify the unmitigated order flow by using the method that we have learned. Now, we have to wait for a valid pullback to happen. And as you can see, the pullback returned to our unmitigated order flow and tested it. By now, we can anticipate two outcomes to happen. Either the price can break below our order flow, forming a failed order flow resulting in no trades, or the price can test the order flow and reverse its direction to move along with the major bullish structure. If it were the second scenario, we can take a long trade above the bullish order flow while keeping the stop loss below the order flow zone. Our minimum target should be the most recent swing high or the major higher high level. In a similar manner, we can discuss the scenario for a bearish market structure. As you can see, the price has formed a bearish breakout structure when it broke below the previous major swing low level. We can mark the unmitigated order flow zone here. Then, we will have to wait for a valid pullback to happen. We can observe that the pullback returned to test the unmitigated order flow. As in the previous scenario, two outcomes are possible. First, the price could just break past the order flow, resulting in no trade. The other scenario is when the price tests the bearish unmitigated order flow and reverse lower to move in the existing major market direction, which is bearish. In that case, we can look to take a short trade below the order flow after it has been mitigated while keeping our stop loss above the order flow zone. And our minimum target level should be the most recent swing low level or the lower low level. This order flow concept can also be applied to the minor market structures or in your lower time frame charts for the sake of taking short-term trades or for grabbing some quick points. I have marked out some bullish as well as bearish cases here. An important point to note is that if there are multiple unmitigated order flows formed within a major structure, then there is a high probability that the market will return back to the most extreme order flow while failing all other order flow areas. Or in other words, the extreme order flow zones have a higher probability of providing us with a successful trading opportunity. Now you can pause the video and take a note of the points mentioned, or else the video will get very long. I hope this will be useful for many scalpers and intraday traders who just wants to catch a few quick points. Now, there are a few drawbacks with order flows that all traders need to be aware of. First of all, stop losses will be considerably large. Since order flow is a zone or an area in the chart, we will have to place our stop loss beyond this zone or area. Even then, we cannot be absolutely sure that the price will not return to hit our stop loss. And because of a large stop loss, the reward to risk also reduces. The reward to risk provided by an order flow trading opportunity is lower compared to that given by an order block trading opportunity. Another problem with order flow is that there is no proper entry criteria. Entering a trade position from an order flow zone is mostly about our intuitions and reward to risk considerations. Yet another problem, which is committed due to human error, is the wrong identification and marking of order flow areas. If you make the mistake of marking the order flow wrongly, then most probably the price won't return to mitigate it, or sometimes it will even fail the order flow. Now take a look at this case. Tell me where to mark the order flow area. By definition, a bullish order flow is the last selling move before the buy. So if you follow this definition blindly, then we will mark this area as the order flow. But this is not the correct order flow zone. The area that we have highlighted is just an internal move or consolidation. The real order flow is this whole selling move. The reason why I say this is because the consolidation did not take out the low of the selling move. If it would have taken out the previous low, then there is no issues with considering it as an order flow. And you can see how the price returned to test the order flow. Similarly, while marking a bearish order flow, which is the last buying move before the sell, you have to make sure if the move is just an internal move or consolidation, or is it actually taking out the high of the previous move. Now, let us shift our attention to order blocks. Order blocks are considered as a refinement of an order flow. Order blocks eliminates a lot of issues that an order flow had. Order blocks provide you with limited trades which are of high quality and have a high probability of success. Secondly, the reward to risk ratio is largely improved when using order blocks. This means the stop loss setting is much tighter. The trade entries are also more optimized due to the limited number of trades on offer. But on the downside, a tight stop loss can be taken out by volatile price swings. Let us first learn the textbook definition of order blocks and how to identify and mark the order blocks. In a bullish market scenario, a bullish order block is identified as the last bearish candle before the buy.
And during a bearish market structure, a bearish order flow is considered as the last bullish candle before the sell. So you have to spot the last bullish or bearish candle before an impulse price move and mark its highs and lows. This is considered as an order block by most stock market teachers, aka gurus. If you follow this logic and start marking order blocks, you'll be shocked to notice that there will be a large number of order blocks on the charts, and you'll obviously be confused as to which order blocks will work and which won't. This is a vague way of explaining what an order block is, and it is of very little use to a trader. The majority of order blocks obtained using this method is useless and it won't work. To identify and mark only valid and high probability order blocks, I will introduce you to 7 important factors. These are concepts that you have already learned in the previous episodes of this SMC course, so it is nothing new and you don't need to stress about it a lot. Here are the 7 factors. The first point is that you should mark order blocks on higher time frames only. So if you are an intraday player, then 15 minutes can be your higher time frame and you should mark your order blocks on this time frame only. Second one is that there should be a valid breakout structure. The third thing is to look for the last buying candle before the sell for a bearish market structure and look for the last selling candle before the buy for a bullish market structure. But certain conditions apply to this step. The fourth factor to notice is that there should be an imbalance or a fair value gap. Another important thing to look out for is that there should be a proper inducement after the break of structure. This is to avoid falling into the smart money trap. Next point is that there should be a proper liquidity sweep of the previous highs or previous lows depending on the market structure. And the final thing to check for is to see whether the order block is associated with an unmitigated order flow. Now, if you manage to identify and mark order blocks based on these 7 factors, then you will come to the realization that there can only be a maximum of 2 valid order blocks within a certain swing move. Also, the minimum number of order blocks within a swing move is 1. We will learn about these 2 valid order blocks very soon. But first, let us discuss in great detail about the 7 factors for identifying and marking valid order blocks. So the first factor is time frame. I have mentioned at the beginning of this course that structure mapping has to be done on higher time frames and trade entries are to be taken on lower time frames depending on your trading style. Similar logic applies to order blocks also. The order blocks are to be identified and marked on your higher time frame charts. These order blocks will be lower in number and has a higher chance of success compared to those order blocks marked on lower time frames. Once the higher time frame order blocks are marked, then we can turn to our lower time frame charts to refine our order block for better entry prices. For example, if you are an intraday trader, then you can mark valid order blocks on your higher time frame, which is 15 minutes. And once you're done with marking the order blocks, you can go down to your lower time frames such as 1 minute, 2 minute, or even 3 minute charts and refine your order block for taking better trade entries. This is called lower time frame order flow refinement. This method will help you analyze the trend and take positions with better reward to risk. Now the second factor is to have a valid break-off structure. The market should form a valid break-off structure before we can actually start to spot and mark the order blocks. Order blocks are not valid until and unless there is a proper break-off structure or a change of character in prices. You may already be familiar with how to mark the market structure by identifying bows and chalk. I won't go into all those details. You can always go back and watch the comprehensive video on market structure mapping. Anyways, during a bullish market structure forming higher highs and higher lows, we will only start to look for order blocks when the price has broken and closed above the previous swing high level. In this case, we will look for bullish order blocks since the overall idea is to ride the existing trend. But in case if the market has broken down and closed below the previous major higher swing low level, which results in a bearish break-off character, then we will look for bearish order blocks only. But a valid break-off structure or a change of character is not the only metric to confirm before spotting the order blocks. We also need to check for inducements. I have seen traders mark bearish order blocks on bullish market trends and vice versa on bearish trending markets. They are literally trying to grab the minor or internal swing moves. This may work on some occasions, but most often, the price ends up breaking through these low probability order blocks. Marking order blocks on a higher time frame and then refining it on lower time frame is one thing, but marking counter order blocks against the existing market structure can result in big losses. So I will never ask you to bet against the market. In fact, it is the wrong approach. In a similar manner, you should only mark order blocks once the price has broken and closed below the previous major lower swing low level. This is a valid bearish breakout structure, and for this instance, we will only look to identify and mark bearish order blocks. And if the price has broken and closed above the previous lower swing high level, which is a bullish change of character, then we will look for bullish order blocks. I hope things are making sense. We have already discussed about the third point, but still certain things need more clarification. So in order to identify a bullish order block, you will have to find the last bearish candle before the buy. But it is not so straightforward. There are other things that you need to look for. The point is to check if there is a liquidity sweep involved. This means that the last candle that we have spotted should take out the previous minor low formed. This also means that next candle should not take out the low of our last selling candle. Now, if you are unaware of what liquidity and liquidity sweep are, then I suggest you to watch my videos on the same topic. So if the last selling candle was unable to take out the previous liquidity, or if the succeeding candles take out the low of our last selling candle, then we will not consider this candle for marking our bullish order block. In addition to this, an imbalance should be formed after our last selling candle is formed in case of a bullish structure. So technically, there should be a fair value gap between the high of our last selling candle and the low of the third candle when counted from our last selling candle. It does not matter if this imbalance is wide or narrow. The only condition is that there should be an imbalance between these two candles. As I have mentioned earlier, we should only start checking for order blocks and imbalances only after a valid break of structure or a change of character in the swing structure. If any of these two conditions are not met, then our bullish order block is not a valid one. So if there was no liquidity sweep, then we can shift our order block to that candle which has actually taken out the liquidity or the previous minor low level. This indirectly means that while marking a valid order block, the color of the candle doesn't really matter. What matters is whether the minor liquidity was swept or not. Now, even if we have spotted the last candle which has taken out the liquidity at the previous minor low, if there is no imbalance between our marked candle and the third numbered candle, then we cannot mark this as a bullish order block. And even if there was an imbalance between the highs and lows of these candles, but if this imbalance is mitigated, then also we cannot mark our first candle as a bullish order block. So the fair value gap is the most important factor to consider while marking a valid order block. And once a liquidity sweep and an imbalance is confirmed, then we can mark the high and low of our first candle, which will become our bullish order block. Another interesting observation that might be useful is that once you have identified the last selling candle or the candle that have swept the liquidity of the previous minor low, and if the succeeding candles are formed within the highs and lows of this first candle, then these candles don't really have any importance and these are just internal consolidations. In this case, we will only consider the candle which breaks the high of our first candle, and this will be our second candle. You can then check for imbalance between these three candles and not take into account the consolidating candles. I have talked about imbalances and also about such internal consolidations in my fair value gap episode, so you can check that video to know more. The logic remains the same while marking a bearish order block in a bearish market structure after a valid breakout structure. I won't go deep into all the details here. As always, the first step is to ensure that there is a valid bearish breakout structure. Then you have to look for the last buying candle before the sell. Make sure that this candle has taken out the previous minor high. If it is not the case, you can shift towards the right to find that candle which has swept the previous minor high level. So the color of the candle doesn't really matter when marking the order blocks. What matters is this liquidity sweep. The next factor after this is to check whether there is an imbalance or a fair value gap between the first candle's low that we have identified and the third candle's high. If there is no imbalance or gap between them, then the order flow is not valid at all. But if there is an imbalance between the first candle's low and the third candle's high, then we can mark the order block by drawing lines at the highs and lows of the first candle that we have identified. In some cases, multiple internal consolidating candles can be formed within these highs and lows of our liquidity grabbing candle. you don't have to consider these candles. I have already stated the reason as to why this is so. You can mark the candle which breaks the low of our first candle as the second candle for the imbalance identification. This is how you spot and mark a bearish order block properly. But to filter the best order blocks, you need to consider more factors. Earlier in this video, I have mentioned that there can be a minimum of one order block and a maximum of two order blocks between a swing high and a swing low. These are number 1, the extreme order block, and the second one is the decisional POI or the decisional order block. Both order block and POI or price of interest are used in a similar sense. Now both these types of order blocks work in the market if properly identified and marked. The extreme order block is considered the high probability OB because it is the last resort for price to make a reversal as there is enough liquidity and imbalance available. The reason why there can only be two valid order blocks can be either due to inducements or it can be due to order flow mitigations. I will explain both. Let me start with inducements. I have made a detailed video on inducements in the previous episode. Make sure to watch that video to get a proper idea on the topic. Anyways, inducement is considered as the first pullback after a valid break of structure has happened. The pullback can be a minor one. If you observe in this figure, then the first pullback after the bullish break of structure is marked using a line with a dollar sign. It is essential for price to take out this inducement. Only then we can identify our valid order blocks from the smart money traps. But as you can see here, the price moved higher without sweeping the inducement. The price formed another minor pullback. Keep in mind that the minor pullbacks can be a single bearish candle or a group of candles against the bullish price flow. When price forms a new pullback, then we will shift our inducement level at the low of this pullback. And if the price still moves higher without taking out the liquidity below this pullback's low, then once again we can shift our inducement level to the minor pullback formed at the higher level. And in this case, the market has taken out the inducement as the price has crossed below the pullback lows. Now I will tell you why this is important. See, during the minor pullback after a bullish break of structure, you can mark a bullish order block at one or more of these levels. But the bullish order block drawn at the highest pullback level is of low probability and there are high chances that the market will come back to take out the liquidity and break below this order block and move lower. Many traders make the mistake of marking this order block, and when the price give a reaction near this order block, they initiate a long position. But the chances of this trade failing is very high. So this is not really an order block, but instead it is a trap, commonly known as the smart money trap. So no matter what the scenario, never try to take a trade until and unless you haven't confirmed that the inducement is taken out. Once the inducement is taken out, you can use the order flow mitigation rule to further filter order blocks if there are more than two of them. We will come to this in a short while. Meanwhile, let us understand inducement for a bearish market structure. In this case, the price did a bearish break of structure below the previous swing low and then it formed a minor pullback higher. We will draw a line at the high of this pullback with a dollar symbol to mark the inducement level. And as you can see, market moved lower without taking out this inducement. Then it formed another minor pullback. So now we will shift our inducement level at this pullback high. Then you can notice how the price moved higher and grab the liquidity above this pullback level, or in other words, our inducement is taken out. Once the inducement level is taken, then we can look towards other order blocks for taking a trade. Now, if there are still multiple order blocks available even after applying all these rules, then we can further filter them using the order flow mitigation rule. This concept is very simple and easy to understand. You might already have an understanding of what an order flow is and how it works. So if I were to talk about a bullish market structure, then the last selling move before the buy or the impulse is our bullish order flow, and the last selling candle or that candle which has swept the liquidity of the previous minor low and having a fair value gap between them will be our bullish order block. This rule asks a trader to mark the order flow associated with an order block and then check if the order flow is mitigated or not. In case if the order flow is mitigated, then the order block associated with it will be of low probability, or it can also be neglected. And if the order flow is also unmitigated, then the order block and order flow are both high probability areas from which price can take a reversal. This filtration method using order flows will reduce the number of order blocks marked between a swing low and a high to a maximum of 2 and a minimum of 1. Now finally, let us summarize what we have learned. We will consider a bullish market scenario first. This is a one-day time frame of Euro USD chart, but you can choose any chart on any time frame based on your trading style. Here you can see that the price has managed to break and close above the previous higher swing. So this is a valid bullish breakout structure and we can name it. So the first condition is met. Now as the price moves higher, we need to look for the inducement levels. Inducements, as you are familiar with, are formed at the lows of the minor pullbacks being created, usually after a valid structure break. Here, as the price moves higher, it forms a minor pullback, the low of which we will draw a small horizontal line. The minor swing low is our inducement level. Now price moves higher once again without grabbing the liquidity below our inducement level. As the market moves up, prices forms another minor pullback. Based on our rule, we will now shift the inducement level to this newly formed swing high level. But once again, the market moved higher and formed another single candle pullback without sweeping the previous inducement. Again, we will have to shift the inducement level to this new minor low formed. You can clearly see how we should mark the inducement only on the impulse price move. Now finally, price makes a correction and takes out our inducement level. This implies two things. Number one, the highest price before the inducement sweep will become our higher high. Secondly, it also means that the price can now tap into any liquidity level or zone and probably reverse higher. This is also a go-ahead sign that we require to begin marking our order blocks. So start from the lowest point on the impulse price swing. For finding bullish order blocks, start finding the last bearish candle before the buy, which should necessarily take the liquidity below the minor swing low, and it should also be associated with an imbalance or a fair value gap, which is unmitigated. Now based on these criteria, if we consider this bearish candle, then we would be marking the order block falsely. It is because this candle did not sweep the liquidity and there is neither an imbalance associated with it. The candle which absorbed the minor liquidity is the next bullish candle, and there is a fair value gap between this candle and the third candle, which is unmitigated. So we will have to shift our order block to this first bullish candle. We can mark the highs and lows of this candle, and this is our high probability extreme order block. You might have understood how the color of the candle is less significant in comparison to the liquidity grab and fair value gap criteria. As I have mentioned earlier, a maximum of only 2 order blocks are possible. Here you can see how this bearish candle sweeps out the liquidity below the previous minor low with its deep wicks. In addition, there is also an imbalance or inefficiency between the first and third candles, and it remains unmitigated. So this becomes our second order block. Just mark the highs and lows of this bearish candle. This is the decisional order block, which has a 50% chance of working. In addition to marking the order blocks, also make sure to draw the imbalances or fair value gaps associated with them. Now let's see how the price responded. Price moved lower and it took a reaction from the decisional POI or the decisional order block. It also mitigated the imbalance in that area. Now here's the thing, when presented with 2 order blocks, that is a decisional order block and an extreme order block, we should look to take a position from the extreme order block because this is a high probability order block than a decisional order block, and it also helps us to buy at discount prices. We will talk about premium and discounts in one of our upcoming videos. So here, the price took a reaction from the decisional order block, but then it break down below this order block. Keep in mind that the order flow and order blocks are just a one-time use thing. So we will neglect the decisional order block now. Then the price declined lower and it mitigated the imbalance and interestingly moved higher without taking our high probability extreme order block. One of the reasons why the order block was not tested was due to the fact that the bullish order flow, which is the last selling move before the buy that is associated with our extreme order block, was mitigated, as you can see here. It is one of those filters that you can apply to separate high probability order blocks from the low quality ones. In this scenario, since the price is at a discount valuation and since it filled the imbalance, we can look for long trading setups while keeping our stop loss below the order block area. If you are more risk averse, then you can even set your stop loss somewhere below the imbalance zone. All the minor swing highs will be our minor targets, but one major target will be the previously formed higher high. You can see how the price moved higher. Now let us look at a bearish scenario. This is a 1 hour time frame chart. Here you can see how the price reacted from the previous lower low level, but it failed to break below it. But after a slight pullback, price managed to break and close below the major swing low, thereby forming a valid bearish breakout structure. Once the breakout structure is confirmed, the next step is to find a proper inducement. Usually, inducement is the high of the first minor pullback after a bearish breakout structure. But here, price moved upwards. There is no inducement to be found lower. In such cases, inducement level becomes the high of the last minor pullback before the structure break. I will mark this level and you can observe how the price returned to absorb the liquidity above the inducement. Once the inducement sweep is confirmed, we can establish the lowest price point before the inducement grab as our lower low. In addition, we can expect the market to reverse from any liquidity zones and continue to decline lower. This also gives us a go-ahead signal to mark our order blocks. Let us start from the highest point of the impulse move that generated the structure break. By definition, a bearish order block is the last buying candle before the sell. In addition to this, it needs to sweep the liquidity above the minor highs, and it should also be associated with an imbalance. Now this is the last buying candle, but it has not swept the liquidity. It was this bearish candle that has actually taken out the liquidity above the previous minor high. There is also an imbalance between the first red candle and the third candle. Above all, this imbalance is unmitigated. Now if we mark the order flow, we can see that it is also unmitigated. Therefore, we can mark the high and low of this first bearish candle as our valid bearish order block. This is a high probability extreme order block. Now we will see if there is another order block available. If you look at this particular candle, you can notice how it has taken out the previous minor highs. It is also associated with an imbalance which is unmitigated. So this green candle can be our second order block. We can mark its highs and lows. So it becomes our decisional order block. We can also mark the order flow for additional filtering. We can find that the order flow is also unmitigated. But keep in mind that the extreme order block has a higher probability of success than the decisional order block. Now let's see how the price reacted. First, the price moved higher, mitigated the imbalance, and tested the decisional order block. But it did not reverse. Instead, the price moved upwards, first mitigating the inefficiency there. Then the price moved into the order block. But instead of just testing this extreme order block, price break through the order block. During such an instance, most market participants would expect a change of character. But someone who knows deeply about liquidity and manipulation, they would wait for the price action to complete. And as expected, the price did not break and close above the previous swing high. Instead, it was sweeping the external liquidity available above this major swing high, which is none other than retail stop losses and breakout limit orders. Now the market absorbed the liquidity and closed below our extreme order block. So this order block is still valid. The traders can look for short trades from within the order block, and they can set the stop loss above the order block, or they can even place the stop loss above the wick of the manipulation candle. This is a good location to sell because we are shorting at a premium valuation. All the previous minor lows are potential target levels, but the major take profit level will be a previous lower low level.
We will focus our attention on one of the common manipulation methods in the market. Market manipulation is the cause for losses of many retail traders. But still, there are some proactive traders who trade with this manipulation and they grow their small accounts with the smart money. If you know how the market behaves, you can easily identify the possible manipulation areas for taking advantage of. The manipulation concept that we will discuss is known as the institutional candle or the institutional funding candle or IFC for short. For beginners, the institutional candle is an outstanding concept associated with the market liquidity and price action. In addition, it is also a standalone powerful trading strategy that is followed by many SMC traders and price action traders. So in this video, we will talk about what an institutional candle is and why do these IFC candles form. We will also find reasons as to why these IFC candles work in the markets
and why is it important for traders. And finally, we will also learn how to take trades using this concept. So make sure to watch the video till the end to get the complete understanding of the entire concept. So let's get started. The institutional funding candles are represented as the last opposing single or multiple close candles before the market forms a strong directional move. Those late buying or selling candles with one or more candlesticks within them which runs out of liquidity before heading in the intended direction are referred to as institutional funding candles. These candles simply indicate that the institutions sell before buying and buy before selling. And that is the reason why these institutional candles are also called banker's candle. So it is one of the most popular smart money trading concept out there. Basically, it is the manipulation phase, or we can visualize it as a tricky area where the big banks and institutions manipulate the market for liquidity. So if you remember, I have already talked about the AMD concept of liquidity in the episode about inducements. You can go back and watch that video to get a detailed understanding about the topic. But to brush things up, the AMD concept or accumulation, manipulation, distribution is a three-step process which involves hunting the retailer liquidity in the market by inducing these ill-informed traders to buy or sell at the wrong place at the wrong time in the wrong direction. This IFC concept is one of the popular manipulation techniques used to absorb the retail liquidity. You can easily identify this institutional candlestick pattern in charts with your naked eye. You don't really need any additional indicator to look for it. So if you want a simple hack to identify these institutional candles, then follow this idea. So when you are looking at the chart for institutional candles, give extra attention to the body of the candles and not the wicks. The majority of the volume is held by the body, and big players are trading there. Wicks are not so much important as retail traders are trading there. Now you may ask me, why do these institutional candles form? The one word answer is obviously liquidity sweep. But for the sake of better understanding, let's just take the longer route. So whenever there is a buyer in the market, there must be a seller. So there must be somebody on the other side of the market to take the trade. This is true for all liquid markets and assets. And that is the reason why market prices moves. And this is where the institutional funding candle comes to play, as it acts as a fishing worm of the smart money to grab retail traders' liquidity. Generally, from a retailer point of view, the stop loss is placed above the swing high for a short trade position, and they will set their stop loss below the swing low for buy orders. Now, when institutions and big banks wants to sell, they will need more buyers. It's obvious, right? So what will they do? Keep in mind that these big players are looking to sell at higher prices, so they will require more buyers to buy from them at higher valuations. Most of the time, their modus operandi is the same. Initially, they breach the immediate swing high level with a big bullish candle with little or no wick. On different time frames, you might see different scenarios. You might see one big candle push in the 1 hour time frame, but on the 15-minute or 5-minute time frame on the same chart, you'll be able to see multiple candles push through above the highs. Remember that in the formation of institutional candles, the number of candles is not important. It may be one or more, but the crucial thing is the intention of these candles or the push, which is actually to take out the liquidity. Now, the stop losses of all the early sellers are triggered by this push, which is placed above the high. We know for a fact that the seller's stop losses are actually buyback orders. Besides this, the buy limit orders of breakout traders also exist above the high level. The institutional candles will also trigger these buyers' buy limit orders deliberately. This is the manipulation step. Further, the institutions will grab all the unwilling and willing buy orders as liquidity to sell their positions at higher valuations, and once the liquidity is absorbed, their intended bearish market movement will start. The same case happens during a bullish price move. So the intention of the big institutions is to buy at lower prices. So they will require a lot of sellers to sell at lower valuations, which will become their liquidity. And in order to create this liquidity, the big players will manipulate prices. The price will breach the immediate low or the support level with a big bearish candle with little or no wick. And as mentioned earlier, it can be multiple candles as well. It is not really the number of candles that matters, but it is the intention of these candles or the push. The stop losses of early buyers are triggered due to this price push, which were placed below the lows or the minor support. We know that the buyer stop losses are actually sell orders. Besides this, the willing sell orders of breakout traders also exist below the support level, which are also triggered in the process. And once the institution grabs all the unwilling and willing sell orders as liquidity, their intended upward movement will start. So the agenda of institutional funding candle is to take out or sweep the liquidity above or below the immediate resistance or support lines respectively. Now you can ask me, why do these institutional candles actually work in the market? Now the strong reason why institutional funding candles work in the market is because these are the drawdown or loss of the smart money. I know you are confused, but let me explain. If the big institution wants to buy at lower valuation, they will need more sellers who would sell at lower prices. For generating enough liquidity, they will manipulate the prices. In this case, they will create a single bearish candle or a group of candles below the immediate low or the support level. This means the institutions are actually selling here, but their real intention is to buy. But they sell initially to trap the retail traders in their trades so that they can start using the retail orders to buy at lower prices. And when the price returns back to the previous support level, they would exit their short positions on a break even or on a small loss. And as you can guess, these institutions won't take such unnecessary positions and losses unless they want to make a much bigger gain. So keep in mind that usually when the price comes back to the manipulation zone, smart money would close their counter order with a small loss or break even. As they mitigate their position, these are the best places to take a trade and make some profits by following the footprints of the smart money. Now let us discuss what makes institutional candles important. Institutional candle helps you to determine order flow and market structure. Yes, you heard it right. We know what an order flow is. So a bullish order flow is the last selling move before a buy on a bullish market structure, and a bearish order flow is the last buying move before a sell in case of a bearish trend. Now look at how institution candles form. It follows the AMD criteria. This means the manipulation move, which is the IFC, will act as the order flow since it is the price move against the major trend structure. Now IFC can also be used to determine market structures. This is because institutional candles usually form the extreme highs and lows in a price move before the actual distribution in prices. These highs and lows can act as swing highs and swing lows, which are reference points for mapping the market structure. In addition to this, IFC is also a popular trade entry strategy. You can think of trade setups in the dominant trend direction, and the trade entry orders can be placed after the last price push up or push down beyond the zone, which is an important strategy that many traders follow. Actually, institutional candles forms swing highs or swing lows, so there are high chances that the market will never violate or break beneath the low of the last down close candles in a bullish market, and likewise, price will never violate and break above the last up close candles during a bearish trend. In addition to this, if you have watched my videos on liquidity, that is both major and minor liquidity, and if you have done analysis on the charts, then you might have come across innumerable situations of liquidity manipulations taking place in different locations and in different scenarios. These liquidity manipulations could be near equal highs and equal lows, near supports and resistances, during consolidation breakouts, trendline breakouts, during pattern formations, and so on. And on most cases, within these manipulations, you can spot institutional funding candles which goes deeper to grab the retailer orders. So what I mean to say is that IFC is a very common manipulation type that you can find on the charts. Now let us learn in detail as to how to trade with these institutional funding candles. So first of all, you will have to mark up your major swing points that are formed by the institutional funding candles. Remember that in the upward moving market, the last down close candles are usually respected, while the last up close candles are respected in the bearish trending markets. In case if the market is in a consolidation period, then both these types of institutional candles are respected. Once you have identified the IFC candles, you need to mark the IFC range. For this, you need to select the Fibonacci tool from the toolbar and then select the highest and lowest points in the institutional candles. So the idea is to start plotting the Fibonacci retracement from the origin of the IFC candles. For bearish candles, start drawing from the highest to lowest point, and for bullish institutional candles, begin from the lowest point and follow through to the highest point. The Fibonacci retracement levels will be automatically plotted, but we only require the 0%, 50% and 100% levels. You can go to the Fib settings and change it accordingly. Now, even though you can execute a trade anywhere within the range of the institutional candles, it is mostly preferred to enter a trade either near the opening price of the institutional candles or at the 50% of the push. So you can trade within the Fib 100% to Fib 50% levels. This is your tradable zone. Now, where to take a trade entry is entirely up to you, depending on whether you are aggressive or conservative in your approach. But let me tell you, if you plan to take trades at 50% of the institutional candles, then you might miss some of your entries because price never always returns to the 50% level. But on the upside, if your limit order or market order is executed at 50% level, then you will definitely get a better reward to risk ratio. One additional thing you can do is you can use the Fibonacci retracement tool once again and select the Fib 1 and Fib 0.5 levels. This will generate another Fibonacci level at the 50% of our entry zone. This can further improve our chances of getting into most of the trade opportunities without having to take much risks. When it comes to stop loss setting, your stop loss should be placed above the highs of the institutional candles for the sell orders, and it should be placed below the low of the down-closed institutional candles for buy orders. You can even place your stop loss above or below the institutional candle's body or wick. But I personally prefer to place my stop loss above or below the wick. This is the best and safest place to place your stop loss. Now let's talk about the targets. Your take profits should be placed at the next area of interest or price of interest. It could be the next high or low, support or resistance, supply or demand zone, equal highs or equal lows, where ample liquidity exists to drive the market to the opposite direction. You can also place your take profits by analyzing the higher time frames. I think that as a beginner to SMC concepts, a bigger win rate is more important than the large reward to risk ratio. So you should cut over expectations and place your targets at a specific logical area and be consistent with it. And always try to improve your entries, thereby you can maximize your rewards. Now let's take an example to understand the concepts even better. In this case, the price is trading within a range. In such cases, both the up-closed and down-closed institutional candles are usually respected by prices. Now as you can see, price formed equal lows, which I have marked here, and then it consolidated for a while. Then the price moved lower and it broke below the equal lows with candles having deep wicks to sweep the liquidity below this level. And once the liquidity was absorbed, the price moved swiftly, creating imbalances or fair value gaps on the way up. These imbalance formations are very important. It gives a reason for the price to return back and fill the inefficiency that was created. To know more about fair value gaps or imbalances, you can watch my video on the same topic. Anyways, when the price starts to move higher, we can identify the manipulation candles. In this scenario, these are the last down close candles. I have marked these candles. Now I have to identify the tradable IFC range. For this, bring up the Fibonacci retracement tool and select the highest point in the IFC candles and then drag the cursor and select the lowest point in the institutional candles. This will give you the IFC range. As I have mentioned before, when price returns back to this range after mitigating the imbalance, we will look for long trading opportunities from Fib 1 or Fib 0.5 levels. If you want, you can also draw another Fibonacci retracement between the Fib 1 and Fib 0.5 levels to obtain another 50% level at the midpoint of these two levels, which will give a higher probability that your buy limit orders will get executed, and this intermediate level will provide a better risk to reward than the Fib 100% level. Now let us observe what the market did. The market moved higher, broke above the consolidation, after which it reversed, took a short reaction, and once again break below the resistance turn support level. Further, price consolidated near the resistance area where it formed equal highs. I have marked this level. Now the price made a build-up and eventually break above the equal high level to sweep the liquidity above it. After the liquidity hunt, price returned lower. This manipulation was in form of a level breakout following a consolidation. After the manipulation, price declined lower swiftly, creating an imbalance or a fair value gap. This is a classic case of AMD or power of 3 concept. Also, this imbalance or inefficiency is a crucial part of the overall concept because it gives price a strong reason to return back and fill the inefficiency in prices. The manipulation move or the liquidity grab was done by institutional candles. In this case, the last up-close candles are our IFC candles. I have marked these institutional candles here. Now, we have to mark the tradable IFC range using Fibonacci tool. For this, bring up the Fibonacci retracement tool and first select the lowest point of the IFC candles and then select the highest point of the institutional candles. Our tradable zone is between Fib 1 and Fib 0.5 levels. You can also mark the intermediate level between Fib 1 and Fib 0.5 levels for getting good results. So the overall idea is to place sell limit orders at any of the mentioned Fibonacci levels when the price returns to fill the inefficiency, and there are very high chances that the price will tap into this Fibonacci range and our sell orders will get executed. Now let's see how the trade has turned out in both the cases. So the price returned to our bullish trade setup. All the buy limit orders between Fib 1 and Fib 0.5 levels are executed. You can set your stop loss below the low of the IFC range. For target placement, you can choose this recent swing low level as your first take profit level. You can also choose the resistance level for target, but the probability of price reaching this level is low. And as you can see, the price moved higher and attained our first target. But the price did not move all the way up. Instead, the price reversed once again and sharply moved lower. Once an IFC range is tested, it is not useful anymore. The price breaks through all these ranges. Keep in mind that our bearish trade setup is still active, and after a while, price reversed sharply and it started to rise again. It came back to fill the price inefficiency and it tested all the sell limit orders placed between Fib 1 and Fib 0.5 levels. In this case, our stop loss can be placed above the high of the IFC candle. Our target can be set as the previous low formed. And as you can see, the price moved lower and hit our take profit level. I hope things are clear now. So you have to identify equal lows, equal highs, support resistance levels where possible manipulations may occur and the institutional candles might form. Then you have to mark up the candles. It might be one candle in the higher time frame and multiple candles in the lower time frame. Now you know how to spot this smart money manipulation. Institutional candle is an advanced price action trading concept also. We will learn an advanced tutorial on a rather interesting smart money concept, which is regarding the identification and utilization of flip patterns and flip zones. So in this video, I will talk about flip zones, the different types of flip entry models, and I will also give you the important rules to identify and mark valid flip zones. These are powerful concepts in smart money strategies, and neglecting them in your trading may leave you lagging behind the changing market trends. So by understanding and utilizing these essential techniques, you will gain the adequate expertise to identify high probability flip setups, and you will also be able to make well-informed trading decisions. So if these series of videos are useful for you, then give this video a thumbs up to show your support, and make sure to subscribe to our channel and also enable the bell notification to get all the latest updates. So without wasting any time, let's get started. As the name suggests, the term flip in the flip pattern indicates a market transition from one direction to the other, thereby implying a change in the market sentiment. This could be a shift from bullish to bearish or vice versa. Flips are often viewed as crucial turning points or areas where the traders have potential opportunities to capitalize on the changing market dynamics. The flip trading entries are considered as an effective method to enter quickly during market declines or surges. So, how can you define a flip pattern? You can think of a flip pattern as a particular price pattern or configuration on the price chart that indicates a potential shift or flip in the market direction. Flips signal a transition from an existing trend to a possible reversal, or it indicates a shift in the market sentiment. So the overall idea of a flip pattern is simple. A flip pattern involves reacting to a significant price zone in the chart and then effectively breaking through it. These significant price zones could be support or demand areas, order blocks, gaps, important highs or lows, etc. Now, the flip patterns are majorly divided into two main categories. These are reversal flip patterns and continuation flip patterns. We will talk in detail about each one of them. First, let us look at how we can spot a reversal flip pattern. Let's imagine a bullish market structure with a consistent formation of higher highs and higher lows in prices. To identify a valid flip pattern, we have to consider a few key criteria. First of all, the price should face a rejection from a higher time frame supply zone. So when you mark the structure on higher time frames like 1 day or 1 hour or any higher time frame based on your trading style, you will be able to identify such price zones where we can expect the price to face some resistance. These could be major resistance areas, unmitigated higher time frame bearish order blocks, price gaps, daily, weekly or monthly highs, etc. All these levels or zones can act as a supply zone and reject the prices. Now, after encountering a resistance at the supply zone and declining, the price should retest the last formed demand zone and then move upwards, showing a rejection from this demand zone. But the crucial thing to make sure is that the price should not establish a new higher high, but instead, the price should break through the previously tested demand zone. This break of the demand zone forms a new supply zone, which is referred to as a flip zone. This flip zone is marked on the basis of an imbalance formed while breaking through the demand zone. We will talk about how to mark a flip zone in a short while. It is vital that we closely monitor this newly formed flip zone since the likelihood of price returning back to retest this zone is very high. It is usually recommended to place a sell limit order within this supply flip zone to enter into a short trade position when the price retests the flip zone. The same principles apply in a bearish scenario. In case if the market is consistently making lower highs and lower lows, thereby indicating a bearish market trend, then we will wait for price to find a support on a higher time frame demand zone and then move higher. This demand zone could be an unmitigated higher time frame bullish order block, a major support level, price gaps, daily or weekly or monthly lows, etc. As the price decline lower, it should react with the last formed supply zone on the same time frame that we are analyzing and then move lower. But the crucial part is to make sure that this price reaction should not establish a new lower low, or it should not form a bearish break of structure, but instead the price should break through the previously tested supply zone. This break of the supply zone will form a new demand zone, which is called our flip zone. Marking the flip zone is based on price imbalance formed during the supply zone break. We should closely monitor this flip zone because there are high chances that the price could return back to retest this zone. It is a usual practice to place a buy limit order within this demand flip zone so as to enter into a long trade position when the price retests the flip zone. Here, I would like to highlight a key point. A flip pattern wouldn't exist without a reaction from the last demand or supply zone. At least some of you might look at this and ask me, isn't this a change of character? Although the flip pattern shares similarity with change of character pattern, not every change of character is a flip. But on the opposite, every flip is a change of character. Actually, a flip is a specific type of change in the market dynamics where the price reverses and establishes a new structure. This pattern, as I have already mentioned, is characterized by a clear rejection from the last supply or demand zone, followed by a subsequent break of that price zone, creating a flip zone. Setting up trades for the flip pattern is similar to those setups that we have for a change of character pattern, thereby allowing the use of both aggressive and conservative entry types with the flip zones. We will not delve deep into each of these entry types in this video. We will talk about all the entry types and risk management strategies in the next season of Smart Money Concepts. But now, let's briefly analyze the flip pattern through a detailed candlestick analysis and come up with some rules to identify the best reversal flip patterns. It is observed that the flip pattern's effectiveness is greatly enhanced when the price reacts aggressively and push away from the demand or supply zone, and then swiftly breaking through either the last demand zone or the last supply zone, thereby leaving behind an inefficiency. We have already made a video about inefficiencies or imbalances or fair value gaps in this course. You can check it out if you want to know more. If you have spotted an imbalance or inefficiency in price while breaking the supply or demand zone, then all you have to do is to find the extreme candle formed during the price pullback from the supply or demand zone before the price break through the supply or demand zone. You can mark the highs and lows of this candle using a rectangle, and this will be our flip zone. It is even better if this extreme candle is followed by a large bodied imbalance candle. But just keep in mind that the breakout move should be associated with a price imbalance. We will understand the reason for this in a short while. Now, it is crucial to recognize the fact that the strength of demand or a demand zone can be assessed by the level of rejection that it provides to prices and its ability to drive price to new higher highs. If the demand associated with the zone is weak and it fails to generate substantial momentum and eventually leading to a break through the zone, then it signals a shift in control towards the new supply zone, or we can say that the bears are gaining dominance. So as SMC traders, we can concentrate on trading the supply side of market in these situations. On a similar note, the strength of a supply zone can be gauged by the level of rejection it provides in pushing the prices to form new lower lows. If supply turns out to be weak and it fails to produce substantial price momentum and thereby eventually leading to a break through the zone, then it signals a shift in control towards a new demand zone, which indicates that the bulls are gaining traction. So as an SMC trader, you can focus on trading the demand side of market, that is, look for long trading setups. Now, let's outline some rules and other criteria for identifying valid and high quality flip patterns and zones in the market. I will discuss 4 essential rules that you can follow in order to identify valid flip patterns and zones with a high probability of success. The first rule states that for a reversal flip pattern to be considered valid, the price must first mitigate and reverse from a higher timeframe supply or demand zone. This rejection from the higher timeframe supply or demand zone indicates the possibility of a change in the market sentiment, thereby setting the stage for a potential flip to occur. In other words, the price should react from a significant supply or demand level before forming the flip pattern. So if the price fails to mitigate a higher timeframe supply or demand zone and then simply forms a flip pattern, it cannot be considered a valid flip pattern. Now let's talk about rule number 2. This rule states that for a valid flip pattern to occur, the price must react from a supply or demand zone, create a pullback, and then break through the supply or demand zone. Without a pullback or any rejection of price from the supply or demand zone, the pattern cannot be considered as a valid flip pattern. Moving on to rule number 3, this is a very important criteria that needs to be satisfied. It states that a high quality flip pattern should create a significant imbalance or inefficiency when flipping a demand or supply zone. This imbalance or inefficiency should be associated with a clear change of character, or in other words, it should involve a swift, powerful price movement that invalidates the previous market sentiment. Let us understand the reasons why this is very important. Imbalance represents an inefficiency between buyers and sellers, leading to a disequilibrium in prices that needs to be filled. Often imbalances are seen as a gap within the candles. These are also known as fair value gaps. To understand this better, we will consider 2 scenarios. If a 3-candle sequence, as shown here, lacks gaps between the high of the first candle and low of the third candle in case of a bullish scenario, and if a 3-candle sequence lacks a gap between the low of the first candle and high of the third candle in case of a bearish scenario, then these are examples of efficiency in the market. This means the price action is balanced and there is no imbalance or inefficiency that needs to be filled. Conversely, the presence of a gap within the first and the third candle, as shown in these scenarios, signifies an inefficiency or imbalance in prices that need to be filled in order to balance the price action or to make the market efficient. Therefore, the presence of an imbalance during the supply or demand zone break will increase the probability of the price returning back to fill this inefficiency, which will in turn improve the chances of our flip zone being tested. I hope things are making sense. Now the last rule, that is rule number 4, emphasizes that a valid and high probability flip zone must be unmitigated. It means price should not test our flip zones when moving to break through the supply or demand zones. Flip zones are considered as one-time use thing, just like order flow or order block areas. We will focus on only those trading opportunities when the price first enters a flip zone. Once a flip zone has been mitigated, meaning the price has moved beyond its boundaries and the inefficiency associated with it has been filled, it will lose its significance as a trading area, and we will not consider it as an area or price of interest for our future trades. And subsequent retests of flip zone may not offer the same trading opportunities as the initial trade entry. Now, we can use aggressive or conservative entries when trading with the flip setup. As I have mentioned before, we will cover different SMC entries and risk management strategies in the second season of this SMC course. But to give you a general idea, while trading the reversal flip setups, take a short trade from or within the supply flip zone and take a long trade from or within a demand flip zone, and price pulls back to fill the inefficiency formed during the breakout. Now that we have extensively discussed the reversal flip pattern, let's explore the specifics of the second flip pattern type, which is the continuation flip pattern. The continuation flip pattern can be divided into two types. It can be either a supply to demand flip pattern or a demand to supply flip pattern. Let's begin with the supply to demand flip pattern. The supply to demand flip pattern is a type of continuation flip pattern that involves a price transition from a supply zone to a demand zone. As the name suggests, it implies a shift from a supply zone to a demand zone. This flip pattern indicates a decrease in the selling pressure and an increase in the buyer control or dominance, thereby suggesting a potential continuation of the bullish trend. Traders spotting this pattern can seek opportunities to enter long trade positions as the price reverses from the supply zone and move towards a demand zone. Now let's look into this scenario in greater detail. For this, let us consider a bullish market where the price has mitigated the extreme demand zone or the extreme bullish order block and begin to reverse, thereby continuing its upward movement towards the next unmitigated higher time frame supply zone. However, in this scenario, an interesting twist unfolds. Instead of respecting this unmitigated supply zone and reversing lower, the price sharply surges upwards, breaking through the supply zone. So this break of the supply zone indicates a lack of bearish momentum to sustain the selling pressure. It also implies that the bulls have taken control, thereby suggesting a potential continuation of the existing bullish trend. This scenario creates a perfect demand zone that is generated by the price wave that flipped the supply zone. So the new demand flip zone can be marked as the extreme candle in the price wave that caused the break above the unmitigated supply zone. Also keep in mind that here also the price needs to form an imbalance or inefficiency during the breakout wave. Typically, after such a flip pattern formation, the price may return to this flip zone to mitigate it and then resume its upward movement. The reason why price returns to this flip zone is due to the imbalance created by prices during the inefficient breakout move. This is what we call a supply to demand flip pattern. It signals a shift in market dynamics from selling pressure to buying pressure, presenting a potential opportunity for traders to consider entering into long trade positions, thereby anticipating the continuation of the bullish trend. Similar concepts apply to demand to supply flip pattern as well. Let's talk about it now. In this pattern, the price shift from a demand zone to a supply zone, suggesting a decrease in buying pressure and an increase in the selling interest, thereby indicating a potential continuation of the prevailing bearish trend. In this scenario, we have a bearish market where the price enters the extreme supply zone and starts to reverse, continuing its downward movement towards the next unmitigated higher time frame demand zone. However, something interesting occurs in this situation. Instead of respecting this unmitigated demand zone and reversing higher, the price sharply pushes downwards and breaks through the demand zone. This break of the demand zone indicates a lack of the bullish momentum in the market, thereby signaling a shift in control from buyers to sellers. This creates a perfect supply zone that is generated by the price wave that flipped the demand zone to the downside. So the new supply flip zone can be marked as the extreme candle in the price wave that caused the break below the unmitigated demand zone. In this case also, price needs to form an imbalance or inefficiency during the breakout price move. Typically, after such a flip pattern occurs, the price may retrace back to our flip zone to fill the inefficiency and thereby even mitigate the supply flip zone before resuming its bearish movement. So this is what we refer to as a demand to supply flip pattern. It denotes a shift in the market dynamics, suggesting a potential opportunity for traders to consider entering short positions, anticipating the continuation of the prevailing downtrend. Now, let us look at an example. Here, we have a 1 hour time frame chart. The price has formed a series of bearish breakout structures, indicating a bearish trend. We can also notice an unmitigated demand zone in the 4 hour time frame. Upon reaching this higher time frame demand zone, many traders would expect a potential reversal and they would start looking for signs of a change of character to enter into long trade positions. But contrary to their expectations, price taps into the 4 hour demand zone, experiences a minor pullback, and it crashes downward with significant momentum. This aggressive price move is associated with inefficiencies or imbalances that needs to be filled to regain the balanced price action. This movement causes a flip in the demand zone, indicating a shift in the market dynamics and potentially signaling a continuation of the bearish trend. We can mark this newly formed supply flip zone at the extreme candle of the inefficient price wave that caused the break of the higher time frame demand zone to the downside. The break of the demand zone also signals a lack of bullish momentum, indicating a shift in control from buyers to the sellers. And as you can see on the chart, the price retraces back to the supply flip zone, experiences a reaction, and then aggressively move downwards with significant momentum. Traders can look to take short trades from within the supply flip zone formed. I will talk about breaker blocks, mitigation blocks, and how you can use these concepts to improve your chart analysis. I will explain what these are, the psychology behind them, and why they work in the market. We will also learn how to identify and trade them. Breaker blocks and mitigation blocks are reference areas on charts where you can potentially find a trade opportunity. Breaker block and mitigation block concepts are almost the same, but their formation pattern is different. The general definition of a breaker block and mitigation block are similar. The general definition states that a breaker block or even a mitigation block is a failed order block that turns into another supply or demand area on the chart. From my basic price action course, we know that whenever the price breaks through a resistance level, it becomes a support due to the behavior of market participants. Similarly, whenever the price breaks through a support level, it starts to behave like a resistance when the market taps into that area again. This is the simple principle of polarity. The same concept applies to breaker and mitigation blocks as well. The market could ignore an order block's supply and demand for many reasons. These could include a shift in the market structure, price being overvalued or undervalued, price tapping into higher time frame key levels or prices of interest, and there can be many more such reasons. Now, when a valid demand level fails to reject the price, and if the price breaks through, it becomes a supply level. The overall logic is correct, but involving order blocks into the mix is what I cannot digest. Considering mitigation blocks and breaker blocks as failed order blocks doesn't always make sense. If you have watched my video on order flow and order blocks, you might have noticed the number of criteria that needs to be satisfied in order to identify a valid order block, be it a valid market structure break, an inducement, a proper liquidity sweep, presence of an unmitigated imbalance, etc. You might have also realized that order blocks are not always found at the extreme swing points. We might have to shift our order blocks for obvious reasons. Now look at these two figures where I have marked a breaker block and a mitigation block. One thing that catches the eye is that both these figures are associated with a change in the market structure or simply a change of character. Another important observation is that both these blocks are formed at the extreme points of the price swing. So calling it a failed order block doesn't actually do justice for order blocks because order blocks don't always get formed at the extreme swing points. This is why I don't want to involve order blocks when it comes to breaker blocks and mitigation blocks. There is one other obvious reason which will strengthen my analysis. Comment down below if you have spotted it. I will reveal it when we talk about the mitigation blocks. Having said that, what is a proper way to define breaker blocks and mitigation blocks? This idea is simple to grasp if you associate it with basic price action. In the smart money trading concept, it is called a breaker block and a mitigation block. And in the price action concept, it is called a breakout and retest. The idea behind a breakout and retest, or breaker block or mitigation block, is that if the market can successfully retest the breakout level and continue in the same direction of the breakout, it confirms the breakout's validity and suggests that the market will likely continue moving in the direction of the breakout. In SMC terms, there is liquidity on offer above the extreme swing highs and below the swing low levels. So here, in search of liquidity, the market can break through the extreme swing low level, forming a bearish change in the market structure. This further brings in a lot of sellers who would start shorting the market while placing the stop losses above the extreme swing low level or the support. So the market will likely return back to sweep these stop losses and limit orders which are accumulated above the support. So this is actually the reason why breaker blocks and mitigation blocks work in the market. Let's learn how to identify a breaker block. A breaker block involves looking for key support or resistance levels on a price chart that may cause a significant change in the price direction when the level is broken. So when a support resistance or supply demand level is breached, it is considered as a significant signal that the price may continue to move in the breakout direction. Once the breakout is established, we have to wait for the price to return to the breakout level to confirm that it has become a new support or resistance level. And once the level has been confirmed, traders can enter a trade in the direction of the breakout. So a breaker block can be an area of supply or demand which was broken through by prices, leading to a change in the structure, and it is only confirmed after price retest back to the breaker block. It should be noted that the polarity of the breaker block changes after the breakout. That is, if it was a supply zone, it would become a demand zone after breakout and vice versa. This is the whole idea behind identifying and trading breaker blocks. But let's dive deeper into the entire process. We will begin our discussion with a bearish breaker block. For identifying a bearish breaker block, first we need to identify a swing high and a swing low in prices. Then, the market should break above the high to form a new higher high. We don't have strict rules here, like the price should break and close above the previous high and it should take out an inducement. Nothing like that is required here. Even if all these conditions are met, then also it is fine. In this case, the price has to just break above the previous high to create a higher high point. This could even be the wick of a candle. It should just sweep the liquidity available above the previous high. But if this move is associated with an inefficiency, then it would be even better. This would mean that more participants would expect the price to come back lower to fill the imbalance, and these players will look to go long from these discounted valuations. Once the higher high is formed, the price should move lower and break below the previous low to create a lower low. But here, it is recommended that we should wait for the price to actually break and close below the previous low. So essentially, there is a break of a high and a low. Once the lower low is confirmed, we can identify a breaker block. For this scenario, the last down close candle or the deepest or lowest candle in the group of the last consecutive down close candle will be our bearish breaker block. In case if there are 3 or 4 consecutive down close candles, you have two options. One is to mark the whole area from the highest to lowest point, including the wicks. The second option is to mark only the highs and lows of the last down close candle or the lowest candle in the mix. I would recommend using the second method because in the first scenario, the risk associated with it and the stop loss placement would be higher. It is vital to involve the lowest candle in the swing low, and it doesn't matter what the color of the candle is. Now, this block used to be a demand zone, but now it has been converted to a supply zone. Unlike the case of an order block, we don't have to see if there is an imbalance and a liquidity sweep, and unlike an order flow, we don't need to check if it is unmitigated. For a bearish breaker block, we just need to find the last down close candle or the lowest candle in the series of consecutive down candles and mark them from wick to wick. Once the breaker block is identified and marked, we expect the price to return back to this breaker block and then continue to decline lower. The breaker block is validated when the price returns to retest it. But here, I would like to add an additional condition to make this setup a high probability one. The condition is simple. When the price breaks through the breaker block, it should be associated with an imbalance or a fair value gap, specifically a CB, that is a sell side imbalance and a buy side inefficiency. If a sell side imbalance is generated during the breakout below the breaker block, this will become a high probability setup because it gives price more reason to retest our breaker block, as the price imbalance need to be filled in order to make the market efficient again. This setup is known as the unicorn setup. Let us briefly understand the logic behind the whole concept. The market forms a new higher high, but contrary to forming a higher low, the market breaks below the previous low and makes a change of character instead. As a result of the aggressive move breaking below the previous low, the directional bias has changed to bearish, and our demand level will turn into a supply level after this break has occurred. The psychology behind the breaker blocks is that the traders who got long from the demand areas are now trapped after the bearish market structure shift. So they would want to wait for the price to get back to their break-even spot where they can close their long positions for little to no losses. Also, traders will start taking short trades here since they see this area as a key area of supply. The outcome of this double action is what makes the price reverse from this area. So one of the key points here is that a breaker blocks forms when we have a run of liquidity before a market structure shift. Keep in mind that this breaker block concept is applicable to the internal market structures also. We can take trades from breaker blocks when they are formed within the minor structure. Breaker blocks are one of the 7 institutional reference points in SMC, which is very important when using the PD arrays. We will talk about PD arrays in the penultimate episode of this season. Anyways, when price returns back to the bearish breaker blocks and move lower, we can look to enter into short trades. Now, another thing you can do is to draw a Fibonacci retracement connecting the highest and lowest points on the breaker block. We only need the 0%, 50%, and 100% Fibonacci levels. You can adjust this in the settings. This way, we can optimize your trade entries. You can look to place sell limit orders or take short trades between the Fib 0.5 and Fib 0 levels. You can set your stop loss above the breaker block or above the Fib 1 level. You can set your targets based on the previous market swings, or you can even use the price projection method for setting the take profits. We will talk about breaker block trading strategies in the second season of the SMC course. Anyways, let's now learn about bullish breaker blocks. Here also, we need to identify a swing high and a swing low. The price should take out this low and form a new lower low. This is a liquidity sweep below the previous low. It is better if this particular move is associated with an inefficiency. Once the lower low is established, we want the price to swiftly move higher and break and close above the previous high, thereby forming a new higher high. When the price breaks out above the previous high, we can mark the last up close candle or the highest up close candle or the group of consecutive up close candles in the swing high. This becomes our bullish breaker block, which acted as a supply zone before, but now it is converted to a demand zone after the structure change. As mentioned before, it is ideal to mark only the last up close candle or the highest up close candle when dealing with a group of candles when drawing the breaker block. The color of the candle doesn't really matter. This will help us with better risk management. Now, if the breakout move is associated with a fair value gap or an imbalance, specifically a busy, that is a buy side imbalance and a sell side inefficiency, this gives price a reason to return back to fill the imbalance and thereby test our breaker block. Then this becomes a high probability trade setup known as a unicorn setup. Now when the price returns back to our bullish breaker block, we can plan to take long trade positions. We can use a Fibonacci retracement tool to mark the Fib 0, Fib 0.5 and Fib 1 levels by connecting the lowest and highest points in the bullish breaker block. This will help you optimize your trade entries. You can place buy limit orders between Fib 0 and Fib 0.5 levels. You can set your stop loss below the breaker block or below the Fib 1 level. You can set your targets based on the previous market swings or you can even use the price projection technique for setting take profits. So some of the key factors that you need to consider while trading breaker blocks are: number one, market structure. You need to identify the current market structure before looking for breaker blocks. Market structure includes defining the market direction, supply and demand areas, higher time frame key levels, liquidity areas, etc. Number two is validity. Make sure the breaker block you identified is valid. Breaker blocks are created by a run of liquidity before the market structure shift. So you need to look for sharp moves with fair value gaps between the wicks that creates inefficiency. And finally, number three is confirmation. Wait for confirmation before entering a trade. Confirmation can be in form of many price action signals, candlestick signals, volumes, etc. Now, let's quickly dive into mitigation blocks. We will begin with a bullish mitigation block. So first, we need to look for a swing high and a swing low. Then mark these points. Now the prices moves down, but it fails to break below the low. It is unable to take out the liquidity below the low. The price moves higher swiftly, breaking through the high and closing above the high, resulting in a market structure shift. Once the breakout above the high is established, we can mark the last up close candle or the highest candle in the series of up close candles forming the previous swing high. This will be our bullish mitigation block. It is ideal to mark the highs and lows of the last up close candle or the highest candle in the mix as the bullish mitigation block when there are multiple consecutive candles, as it provides better reward to risk for the trades. Now the color of the candle doesn't really matter much. In addition to this, if the breakout move is associated with an imbalance or a fair value gap, more specifically a busy, that is a buy side imbalance and a sell side inefficiency, then this will become a high probability setup for our trades. This inefficiency will be a motive for prices to return back to fill the imbalance and thereby even testing our bullish mitigation block. We can look for long trades from this mitigation block. You can also optimize your entries using Fibonacci levels. For this, extend a Fibonacci retracement from the lowest to highest points of the mitigation block. We only require the 0%, 50% and 100% levels. So the idea is to place buy limit orders between Fib 0 and Fib 0.5 levels. You can set your stop loss below the mitigation block or below the Fib 1 level. As you can see, the only difference between a bullish breaker block and a bullish mitigation block is that the breaker block is associated with a liquidity sweep below the lows, thereby forming a lower low. But in case of mitigation blocks, price fails to execute a liquidity run below the previous low, thereby failing to create a lower low. This is the reason why mitigation blocks are also known as swing failure patterns or swing failure blocks. This also proves another important point. Since the price was unable to break the previous low, this means the use of order blocks as mitigation blocks cannot be justified. Think about it. The first condition that needs to be satisfied if we are to identify order blocks is that the market needs to form a valid breakup structure. But here, the price didn't even sweep the previous low. So the concept of order blocks being used as supply or demand area is significant in this case. This is why I refuse to accept the idea of mitigation blocks and breaker blocks being considered as failed order blocks. I hope you get the essence of it. Now keep in mind that just like a breaker block, the mitigation block is also one of the 7 institutional reference points in SMC. Mitigation block trading is also applicable in minor structure. Mitigation blocks can be used to take trade positions from the internal market structure when formed within a PD array. Now let's quickly touch upon a bearish mitigation block. As always, identify the swing high and swing low in prices. In this case, price fails to sweep the liquidity above the high and it swiftly declines down, breaking and closing below the previous low. So the price was unable to establish a new higher high. So this is a swing failure. Once the breakdown below the low is confirmed, we can mark the last down close candle or the lowest or deepest candle in the mix, including the wicks, and this will be our bearish mitigation block. If there is a price imbalance or a CB associated with the breakdown move, then the probability of price returning back to our mitigation block increases because the price will try to fill the inefficiency. For trade entries, use Fib 0 and Fib 0.5 levels to place sell limit orders. You can set the stop loss above the mitigation block or even above the Fib 1 level. Now, being a swing failure pattern, I'm not particularly interested in trading from these mitigation blocks because liquidity is still available beneath these swings, due to which the market could just reverse, thereby hitting our stop losses and taking us out of the trade. So be a little cautious while dealing with mitigation blocks. We will learn about rejection blocks. Rejection block is a sophisticated concept in SMC methodology that is essential for identifying potential reversal points in the market. This is another important reference point in smart money concepts. So in this episode, we will discuss what rejection blocks are, how to identify and mark these blocks, and we will briefly talk about how to trade these blocks. Now, let's begin our discussion on rejection blocks. A rejection block can either be a sell zone or a buy zone that appears on the chart as long wicks or shadows of candles at the market highs or lows. This block is characterized by a specific candle or a series of candles with long wicks, indicating the strong rejection of a price level or a price zone, typically occurring at key support or resistance zones or near important supply or demand zones. This signifies that the market attempted to break through a price level, but the effort was promptly rejected, thereby hinting at a strong underlying market sentiment contrary to the attempted price move. Such patterns indicate a significant struggle between buyers and sellers, leading to a rejection of the prevailing price trend. This pattern is perceived as a clear indication that the market is not ready to sustain prices beyond that level, be it due to extreme opposition or other institutional factors. So, SMC traders keenly look for rejection blocks as they often precede significant trend reversals or retracements, making them invaluable price areas for predicting future market movements, and also helps in strategizing entry and exit points when it comes to trading from these blocks. Now, let us learn to identify these zones. So, what are the things to look out for? A rejection block is identified on a price chart as a specific pattern where the market strongly rejects a certain price level or zone, indicating a potential shift in the trend. So the first point is to identify key areas of interest where the price has a good chance of giving a reversal or a retracement after a rejection. These areas can be support or resistance zones, supply or demand zones, or important highs or lows like the daily or weekly highs and lows, etc. The other point to note is that a rejection block is often represented by one or more candlesticks that show a sudden and decisive move towards an area of interest, only to be followed by an equally sharp reversal. This means that a rejection block is formed only after capturing the liquidity from the previous high or low, or equal highs or equal lows. So in price action, this is called a false breakout, and in smart money terms, this is called a liquidity sweep. Now that we know what to look for in the charts, let us learn to mark rejection blocks in the correct manner. Rejection blocks are classified into two types: a bearish rejection block and a bullish rejection block. The logic for constructing a rejection block is very simple. Let's start with a bearish rejection block. A bearish rejection block occurs when the price spikes up but then falls rapidly, indicating a rejection of higher prices, thereby signaling a potential downward movement. So effectively, we are looking for a swing high, that is, we have to find the highest candle. The high and close price of this candle has to be higher than the high and close of the neighboring candles respectively. In that case, the tail or the wick of this highest candle will be our bullish rejection block. Usually, we consider 3 consecutive candles near the highs for the purpose of identifying a rejection. Out of these 3 candles, the middle candle has to be the highest of them all. The color of the candles doesn't really matter, but what matters is that the high of the middle candle should be higher than the neighboring candles, and the close of this candle has to be higher than or equal to the close of the preceding and succeeding candles. Now, once all these conditions are filled, we can mark the entire upper wick of this highest candle using a rectangle. This will be our bearish rejection block. We expect the price to swiftly decline lower after the rejection. Such a move would mean that the price has grabbed the liquidity above the highs and then it strongly moved lower. This would also signal that big players were involved in the price move. Keep in mind that the area near the highest wick or the rejection block still contains a lot of orders waiting to be executed. These include a cluster of buy stop loss orders and buy limit orders. So we expect the price to return back to this rejection block to absorb the buy side liquidity. When price comes back to test the rejection block, we can look to take short trade entries. We can make use of the 0%, 50% and 100% Fibonacci retracement levels to place our sell limit orders. We can set our stop loss above the bearish rejection block. But the issue here is that since buy side liquidity is available above the rejection block, we cannot judge the extent to which the price will extend itself to sweep the liquidity. There are occasions where the wick of the retest candle breaks above the bearish rejection block significantly. So it is always recommended to patiently wait until the liquidity run is over and the price starts to show signs of a retracement or a reversal. Then only we should initiate a short trade. I don't really appreciate the idea of placing limit orders and stop losses way before the price has tested the rejection block. In such scenarios, there are high chances that your stop loss will be taken out. So be a little mindful about it. Now, talking about targets, you can set your take profit level as any of the nearest support areas or demand zones where the price could potentially face a rejection or a pushback. Now, let's talk about bullish rejection blocks. A bullish rejection block is formed when the price quickly drops to a low point but then rebounds sharply, suggesting a rejection of lower prices and a potential upward trend. So effectively, for a bullish rejection block, we are looking for a swing low. That is, we have to find the lowest candle whose low and close prices are lower than the low and close prices of the neighboring candles respectively. In that case, the tail or the wick of this lowest candle will be our bullish rejection block. Usually, we consider a 3-candle pattern in which the middle candle has to be the lowest of them all. The color of these candles are not really significant, but what is important is that the low of the middle candle has to be lower than its neighbors and the close price of the middle candle should be lower than or equal to the candles on the right and left. If these conditions are fulfilled, then we can plot the entire lower tail or wick of this middle candle. This will be our bullish rejection block. So after sweeping the liquidity below the lows and forming a price rejection, we can expect the price to swiftly move higher. This tells us that the big institutions were involved in this move. It is worth mentioning that the area near the lowest wick or the bullish rejection block still contains a lot of retailer orders waiting to be executed. These include a cluster of sell stop loss orders and sell limit orders placed by those reversal traders who bought from the demand zone and those breakout traders waiting to sell below the support area. This is why we can expect the price to return back to this rejection block to absorb the sell side liquidity. So when the price comes back to test the rejection block, we can look to take long trade entries. We can also make use of the 0%, 50% and 100% Fibonacci retracement levels to place our buy limit orders. We can set our stop loss below the bullish rejection block. Here also, the issue is that since sell side liquidity is already available below the rejection block, we cannot really judge the extent to which the price will go deeper to sweep the liquidity. On some occasions, the wick of the retest candle breaks below the bullish rejection block so significantly that even if your analysis was spot on, you would still end up on the losing side due to an early trade entry. So it is always advised to patiently wait until the liquidity below the rejection block is absorbed or waiting for a clear rejection signal, and when the price starts to show sign of a retracement or a reversal, then only we should enter trades in the direction of the rejection. This would mean initiating long trade positions. Now, I don't generally agree with the idea of placing buy limit orders and stop losses way before the price has tested the rejection block. In such scenarios, there are high chances that your stop loss will be taken out. So trade logically and mindfully. Now, when it comes to targets, you can set your take profit level as any of the nearest resistance areas or supply zones where the price could face a rejection or a pushback. So that is all you need to know about rejection blocks. In SMC, rejection blocks stand as a crucial tool in deciphering the market trends and making informed trading decisions. The key to success lies in accurately interpreting these blocks within the broader market context and using them to pinpoint optimal entry and exit points.
Do you feel like you are not able to catch the price trends at the best spots? And even when you do, your stop loss is either too much or too little, making your profit target a little too far beyond reach or too small, resulting in either bad trades or trades with poor risk to reward. In SMC, there is a concept that can help you fix this trade entry issue. It is none other than optimal trade entry or OTE. This technique relies on market structure analysis and Fibonacci retracements to identify high probability entry points within established trends. By understanding where smart money might enter the market, OTEs can help you get the best reward for your risk. So, in this episode, I will help you understand what optimal trade entry zones are, how to identify OTE zones on your chart, and how to use OTEs for your trades. Let us understand what an optimal trade entry is. So, the optimal trade entry, as the name suggests, is a zone where you are most likely to get the best reward for your risk. Just like I have mentioned, optimal trade entry is basically a trading model based on the retracement of price in a trending market. More precisely, an OTE is the range between the 0.618 to 0.786 levels of the Fibonacci retracement. This zone is where your risk is neither too little nor too high, and it is likely to give you the best return. Now, the core principle lies in recognizing the temporary price retracements within an established trend. As you may all know, markets rarely move in a straight line. In fact, price moves in the form of impulses and corrections. The impulse move is the strong move, usually with large-bodied candles in the direction of the major trend, targeting the external range liquidities. On the opposite, the corrective moves happen against the existing trend direction, usually to target the internal range liquidity. Now, these retracements or corrections offer potential entry points for traders to capitalize on the trend continuation. So, by combining the market structure analysis, Fibonacci retracements, and some other smart money concepts, OTEs can equip you with a targeted and high probability approach to entering trades. The core idea of this concept is to align your entries with the potential moves of the big players, thereby positioning yourself to ride the next impulse trend wave they might be creating. In simple words, OTE help us to spot the beginning of the upcoming impulsive movements and define possible targets. But before we get into all that, let us learn how to identify optimal trade entry zones in your chart. Generally, due to the theory behind the optimal trade entry, OTEs are more effective when the market is trending. Keep this in the back of your mind. So, when the price is trending, it forms higher highs and higher lows in a bullish trend, and it forms lower highs and lower lows in a bearish trend. This makes it easier for you to identify OTEs in the trending markets rather than sideways market conditions. With this understanding, I will guide you on how to identify optimal trade entry zones or OTZs in your chart in two simple steps. The first step is to confirm a clear uptrend or downtrend using market structure analysis. Higher high and higher low formations with bullish structure breaks denote an uptrend, while lower low and lower high formations with bearish structure breaks denote a downtrend. Now, once you have a confirmed trend, the second step involves using Fibonacci retracement tool. You need to overlay the Fibonacci retracement levels on the price chart, spanning across the recent swing points. I hope you know how to use the Fibonacci retracement tool correctly. For instance, if you are plotting Fibonacci levels on a bullish swing leg, then you need to start from the recent swing low and proceed to the recent swing high. On the opposite, for a bearish swing leg, you need to start plotting the Fibonacci retracement levels from the recent swing high and then move to the swing low. Now, you'll be able to see all the important Fibonacci retracement levels between 0 and 1. Out of this, the OTE zone typically ranges from the 0.618 to 0.786 fib levels. Approximating this, you can consider it as 0.62 and 0.79 levels. This OTE zone between 0.62 and 0.79 fib levels represents a potential retracement area where prices might stall or reverse before continuing the existing market trend. The optimal trade entry zone uses different levels of the Fibonacci retracement tool. For an ideal OTE setup, I suggest you edit your default fib levels according to the settings I am about to tell you. So, fib 1 level would be the starting position of the swing leg. Fib 0.5 would be the equilibrium level that separates the premium and discount zones. Now, 0.62 fib level would be the OTE zone boundary number 1, and fib 0.79 would be the OTE zone boundary number 2. The optimum trade entry level resides within this OTE zone. The OTE level is the midpoint of the boundary number 1 and 2, which is the 0.705 or 70.5% Fibonacci level. So take note that the actual OTE level is 0.705, but anything between 0.62 and 0.79 still falls within the OTE boundary. Now, fib 0 would be our primary profit target level, and fib minus 0.5 or minus 0.61 would be our second target. So if you're someone who views your charts on the TradingView software, this is what the OTE fib levels will look like to you. And this is how they would look like on the chart. Now you can ask me why this OTE zone is such a big deal when trading. There are multiple reasons why this Fibonacci range is considered an optimal area for trading. The main reason is obviously the higher reward to risk ratio that it offers. For example, let us take the case of this bullish market structure. We know that no matter where our entry is within this correction or retracement, the first target for the trade is this recent high level of the market structure. When the price taps into this level, some traders will close their positions or lock in some of their profits, while others might go long anticipating a breakout. This can create a temporary correction, or it could even reverse the trend direction. Now, keeping this in mind, this level would be our first target. Now, if you enter in the OTZ, your risk to reward ratio would be reasonable. We always aim for at least 2:1 reward to risk ratio, and from this zone or OT, we usually achieve this. That is why trading inside the optimal trading zone will give us a higher reward potential for the risk taken, and it provides a more rational trade within the discount zone in this particular case. Now, the second reason is that we get a much safer trade entry from the OTZ. Let us continue with the previous example. The fact of the matter is that market usually take out early buyers or weak hands and use them as liquidity for future price movements. So, waiting for the price to enter the optimal trading zone within the discount area and then looking for long trade opportunities will instantly increase our win rate. But as always, every strategy has its downsides. In this case, we might miss some trades due to this high conservative trading approach. But a missed trade is always better than a losing trade. Trading is all about probabilities. There is no absolute surety of something happening in the markets. Now, another important reason why OTE zones are optimal is due to the reasonable stop loss. See, in this bullish scenario, the best price level to set our stop loss to stay safe from the market volatility is below this swing low, because if the price breaks through this level, we will have a market structure shift and our trade would be invalidated. So the bulls will do their best to protect this level. So the closer your stop loss is to this level, the safer it is. And the OTZ entry will ensure that this stop loss is reasonable and within our risk tolerance. Now, let's learn how to make use of optimal trade entry strategy. I would say OTE is one of the most straightforward SMC tool with which you can take your trade entries. But there are different ways to go about this. I will teach you all of them. Starting off, we can enter our trades directly on the OTE with the help of other SMC concepts. So the first and most direct way to use OTE is to set your limit orders, be it buy or sell limit orders, depending on the existing trend at the OTE zone. It gets even better when this OTE zone coincides with another important SMC concept like fair value gaps or order blocks. Take this example for instance. The market is in an uptrend because we are seeing a series of higher highs and higher lows. So the first step of trend confirmation is complete. Now, we need to draw the Fibonacci retracement with the OTE settings from the most recent low to the most recent swing high. Here you can notice how our OTE zone coincide with a bullish fair value gap roughly at the same level, confirming our trade. This is a powerful setup because when the price pulls back to these areas, they will act as a support and will likely push the price higher. Now, there might be instances where there will be multiple fair value gaps, like in this case. In such a scenario, we would most probably look to take an entry from the most extreme fair value gap that coincides with the OTE zone. This is because there is a higher chance that the price might use the first fair value gap as liquidity grab and trap retailers who went long there. So, our approach would be to wait for the price to retrace all the way down to the extreme fair value gap and enter the long position there. So the next step is to place a buy limit order at the 0.62 OTE level, which is the upper boundary. If you are very confident about your chances, then you can lower this buy limit order to the 0.705 OTE level also. You can set your stop loss just underneath the most recent swing low or below the Fib 0 level, and place your first profit target as the previous high or Fib 1 level. And as you can see, the price dips into the OTE level and immediately rises to continue its bullish trend. Now, the advantage of using the OTE this way is that it simplifies things. You don't need to worry too much about other complicated trading strategies or concepts. You just confirm the trend, map out your OTE and fair value gaps, and then set a limit order in the direction of your trend. On the flip side, this strategy does not always guarantee trade entry opportunities. The price won't always return to the OTE, so you might miss out on some chances using this method. But like I have mentioned before, no trade is better than a losing trade. Moving on, let's learn how to combine optimal trade entry with market structure shift. So here, the market was in a long-term downtrend, but then price first failed to create a new lower low, which indicates the loss of bearish momentum. Then, the price broke the supply level to the upside. This is a bullish change of character, and it shows that the sellers are no longer in control and suggest a potential reversal to the upside. Now, we need to wait for a bullish break of structure to happen. And once we see a break of structure above the previous swing high, it indicates that the buyers are now completely in control, marking a complete market structure shift from bearish to bullish. Now, our bias is to look for long trading opportunities to benefit from the bull market. Even though the price has a high chance of continuing upwards, we can't just enter at any random location, because we could still get stopped out if we enter at the wrong place. This is where we make use of the concept of price swings and optimal trade entry. In this case, our directional bias is bullish and we have enough space before reaching the next important level, which is this high right here. So we can apply the Fibonacci retracement tool to this latest impulse swing leg and then set a buy limit order at the 70.5% or 61.8% Fibonacci retracement levels. You can set your stop loss below this swing low and you can place your first target as the previous swing high. This setup can be further enhanced if there is a bullish fair value gap or an order block coinciding the OTE zone. So this is how we combine optimal trade entry concept with the market structure shift concept to enter high quality trades. Another method you can implement is using multi-time frame analysis. In this particular trading setup, we will use two time frames to enter into a trade. Most of our analysis is carried out on the higher time frame charts like the 1 day or 1 hour time frames, and then we will zoom into the lower time frame chart like 15 minutes or 5 minutes to find trade confirmation and to enter into a position. Now, let's take an example to understand this better. So this is a 1 hour time frame chart and we have a clear uptrend. let's apply the Fibonacci retracement tool and mark the optimal trading zone. Like I have mentioned earlier, when the price pulls back to the optimal trading zone, we will then zoom into the lower time frame like 15 minutes or 5 minutes to find an entry. If you notice, on the lower time frame, this correction move may appear as a downtrend. So our goal is to find signals that indicate the downtrend is over and that we can enter a long position in alignment with the dominant bullish higher time frame direction. So what we need is a market structure shift on this lower time frame chart. When we see a change of character happen, we can consider entering a long position. In this trade, we know that the higher time frame trend is bullish and we are in the optimal trading zone. Then you can place a buy limit order at the OTE area and set your stop loss below the lowest point before the market structure shift happen. Now, combining optimal trade entry with other SMC techniques such as fair value gaps, liquidity, order blocks, breaker blocks, or any other entry reasons that you can use to get more confluence can greatly improve your chances of trade success. Now, the OTE is one of the most straightforward concept in ICT SMC. Yet, using it in isolation is not the best approach. You'll need to learn and combine other SMC concepts with OTE to get the best out of it. Even non-SMC trading strategies can work well with OTE. Take a look at these three figures. Can you identify what these highlighted areas are and how they are different? Just write down your answers in the comment box. So the first figure shows a fair value gap. The second one displays an inverse fair value gap, and the last figure portrays a balanced price range. Now, if you have got all three right, congrats. At this point, most of you will have a good understanding on what a fair value gap and inverse fair value gap is. What is left is the balanced price range. So in this video, we are going to learn exactly that. I will help you understand what balanced price ranges are, their formation, identification, as well as their use in the market. Balanced price range or BPR is one of those critical concepts that can aid your understanding of the market and help you find trade opportunities. This is a very useful SMC concept that can complement your trade entries. We will begin with defining what a balanced price range is. So, a balanced price range is a concept closely related to fair value gaps. To understand a balanced price range, you need to have a decent idea on what a fair value gap is. I have talked about fair value gaps and imbalances in multiple videos. I recommend anyone with zero knowledge on fair value gaps to watch the second episode of the first season of the SMC course. Please go back and watch that video before proceeding with this episode. A balanced price range or BPR in SMC trading refers to a specific market condition where the price exhibits a quick upward movement followed by an equally rapid downward movement, or vice versa, where there is a quick drop in the price followed by a rapid upward movement. These rapid price movements leave behind imbalances in price action. More specifically, a balanced price range is the area on a price chart where two opposite fair value gaps overlap. In this case, you can see a bearish fair value gap formation, after which the price retraced back strongly, forming a bullish fair value gap on the way up that overlaps with the bearish fair value gap. Similarly, this is another case where a bearish fair value gap overlaps with a bullish fair value gap on the way down. Just like normal fair value gaps, when the price revisits these areas, price often reacts strongly, making the balanced price range a crucial area of interest for trading. Normally, the price fills this gap before moving in the same direction as the last price movement. For instance, in this case, price could come back and fill the balanced price range formed and then continue to move higher. Now, you could ask me, why is this concept important and why should you learn this? Well, the importance of a balanced price range lies in its sensitivity towards market price movement. When the market approaches a BPR, it often results in a quick and significant price reaction. Before continuing a market movement, the market frequently retests the BPR. This retest is a critical moment for traders to identify potential entry and exit points. This price reaction is primarily due to the presence of two overlapping fair value gaps, which attracts the attention of a lot of smart money traders who can influence market direction. ICT SMC is a very popular trading strategy, especially in the forex markets. So their actions in these areas can significantly impact market direction. Now, let's move ahead and learn to identify a BPR properly. Basically, identifying a balanced price range on any chart involves two key steps. As I have mentioned earlier, this process involves recognizing fair value gaps on both the buy and sell sides of the price. So start by identifying a fair value gap on the sell side of the price. As you might have already guessed, this bearish fair value gap will appear when the price drops quickly, leaving an imbalance between the lowest price of the first candle and the highest price of the third candle. Next up, find a fair value gap on the buy side of the price when the market rises rapidly, creating a similar imbalance. Once you have marked both the fair value gaps, the second step involves looking for a common area where these two fair value gaps overlap horizontally. This overlapping zone is known as the balanced price range. It is the region where the bullish and bearish fair value gaps coincide, thereby indicating a balance between supply and demand at that price level. This indicates efficient price delivery, meaning that the market has effectively filled the imbalance and is likely to respect this BPR area as a strong support or resistance zone. Now, just like the other SMC zones, the BPR also has two types. There is a bullish and a bearish BPR. Let's quickly take a look at each one of them and understand how we can use them for our trades. We will begin with a bullish BPR. A bullish balanced price range is identified on the buy side of the price, and it acts like a region of support for future price movements, which can be used by traders to enter into long trade positions. Now, let's figure out how to take trades using a bullish BPR. So, to trade a bullish BPR, you have to look for bullish market structure on your higher time frame chart where the price is forming higher highs and higher lows. This higher time frame will depend on your trading style. It could be 1 day, a 4-hour, or a 15 minutes, or any other time frame. Let me consider a 15-minute chart. The second thing you need to look for is a bullish PD array within this higher time frame bullish price leg. This could be a bullish fair value gap, a bullish order block, or any other area of value where the price could form a strong rejection. Now, if this internal range liquidity is found within the discount zone, the better it is. Now, when the price approaches the bullish PD array, you need to switch to your lower time frame chart for identifying a market structure shift in this time frame. Here, I have considered a 1-minute chart to see whether there is a market structure shift from bearish to bullish. After you identify a market structure shift, look for a bullish fair value gap which is overlapping with a bearish fair value gap. Now mark the overlapping area. This is the bullish BPR that we are looking for. Now wait for the price to test to this BPR area before you execute a long trade entry. You can place a buy limit order at the high level of this BPR, or you could take a limit entry at the 50% of this BPR level. You can set the stop loss below this BPR, or you could place it below the recent swing low formed before the LTF market structure shift. For setting your profit targets, switch back to your higher time frame and place your target near the next draw on liquidity. A similar approach is applicable for trading bearish BPR. Let's quickly look at this. So a bearish balanced price range can be identified on the sell side of the price, and it can be used by traders to initiate sell trades or short positions. Just like the previous case, in order to trade a bearish BPR, first you need to look for a bearish market structure on your higher time frame chart. Secondly, you need to identify a bearish PD array like a bearish fair value gap, bearish order block, etc. within the higher time frame bearish swing leg. It is better if this internal range liquidity gets formed in the premium zone of this price swing. Anyways, when the price approaches this bearish PD array, you need to switch to your lower time frame structure. Then you need to check for a market structure shift from bullish to bearish. Now, if you identify such a shift in structure, I need you to look for a bearish fair value gap which overlaps with a bullish fair value gap. This overlapping region is our bearish BPR. Now, you have to wait for the price to test this BPR area before you execute a short trade entry. You can place a sell limit order at the low level of this BPR zone, or you could take a limit entry at the 50% of this BPR level. You can set the stop loss above this range, or you could place it above the recent swing high formed after the lower time frame market structure shift. For setting your profit targets, switch back to your higher time frame and place your target near the next draw on liquidity. I hope things are clear.
We will delve into the premium and discount concepts, exploring their application in trading and how they can enhance decision making. We will also talk about the common mistakes that traders make, and finally, we will discuss PD arrays and the hierarchy of different reference points within the PD array. Understanding these concepts can help traders refine their entry and exit points, thereby maximizing the potential for profitable trades. Premium and discount are simple concepts that apply to buying and selling things. This includes buying and selling instruments in the stock market or the forex market. Premium means expensive or markup, and discount means cheap or marked down. This is a basic trading principle that can be used in any market, from consumer goods to securities traded through exchanges or even forex. So, when you buy something at a premium, it means you're paying more than its fair value. On the other hand, buying something at a discount means you're getting it at a lower price than the actual value. These simple concepts can be applied to various products and assets that are traded in the market, such as stocks, currency pairs, or even commodities. If you look at this picture, you will see that markups and discounts can be applied to anything that can be sold on the open market, even if it's a pack of banana chips. The most optimal demand for a pack of chips will be 200 rupees. But as the price gets higher, the demand reduces. And vice versa, the lower the price, the higher the demand. This is simply the law of supply and demand. You can learn more about it in my Basics of Stock Market video. Now, this is quite logical because if a one-stop supermarket chain like D-Mart has a promotion for discounts on their different products, then you will see a lot of people flocking to buy these products like bees on honey. Now, when it comes to trading, premiums and discounts can be marked on a candlestick chart to determine the premium and discount levels within a specific range or price action. And you must all understand that a major player will never sell at cheap prices and they will never buy at higher prices. Premium and discount zones are places where majority of their sales and purchases takes place respectively. When marking premium and discount zones on a candlestick chart, you have the choice to apply this marking to any part of the price or range. Therefore, even despite the strategy you have chosen, you should strive to buy in the discount zone, that is when the asset is trading at a discount, and you should look to sell in the premium zone, that is after the asset marks up or becomes expensive. Think of it this way. When you want to buy something from Amazon or Flipkart, you will look for the best discount that you can get so that you can buy it at a price lower than the actual going price in the market. And when you want to sell the same product after some months in OLX, you will definitely look to get the highest price possible. That is, you want to sell it at a premium or at an expensive price than the actual going price in the market. Now let's learn how to draw premium and discount zones. For this, you will require three things: a swing high, a swing low, and a Fibonacci retracement tool. If you have watched my video on market structure mapping, you will definitely have a good idea on how to spot swing highs and swing lows in a chart. Here, the price is rallying higher. This is an impulse move towards the upside. The swing low is the lowest point in this entire impulse swing move. We will also have to include the wicks, if any. On the contrary, swing high is the highest point within the entire impulse swing move, including the wicks.
Now once the swing high and swing low are identified, we can bring up the Fibonacci retracement tool from the left side toolbar section. Then select the swing low point that we have identified and drag the cursor and select the swing high point. This will automatically plot all the Fibonacci retracement levels. We don't require all these default levels, so we can select the Fibonacci settings and then uncheck all the levels other than 0%, 50% and 100% levels. Then you can click on OK. Now what we have are 3 levels, one at the swing low, one at the swing high, and another at the midpoint between the high and the low. Now the area below the 50% Fibonacci level is considered as the discount zone, and the region above the 50% Fibonacci level is considered as the premium zone. The 50% level is known as equilibrium or mean threshold, which is nothing but the fair valuation of the asset at that particular instance. This is the point where bearish premium arrays and bullish discount arrays meet. It represents a state of balance in the market where supply and demand are equal and the forces of buying and selling are evenly matched. Since the price is rallying upwards, our bias will be bullish. That is, we want to trade with the trend. So we will look for buying opportunities. But as I have stated earlier, we should always look to buy at the discount valuations or cheaper prices. So where will you get the cheapest price? Obviously, you should look to buy from the discount zone when the price makes a retracement or correction in order to get a markdown below the mean threshold. This doesn't mean you should take a long position anywhere in the discount zone. You should take buy positions only from one or more of those prices of interest or SMC reference points. This gives us additional confirmations for our trades. We will talk about these reference points and their relevance when we take up the PD array concept. Now look at the next scenario. In this case, the price has declined lower. This is an impulse move towards the downside. So the first step is to spot the swing high and swing low of this impulse move. Then use Fibonacci retracement tool to connect the swing high and the swing low. This will plot the retracement levels automatically. Now go to the settings and uncheck all those levels that we don't require. Just keep the 0%, 50% and 100% levels. So there is a level at the swing low, one at the swing high, and the last one is at the middle between swing high and swing low, which is nothing but the mean threshold or equilibrium. And above the mean threshold is the premium zone, and below equilibrium is the discount zone. Since the price is declining lower, our bias will be to sell. That is, we will look for short trading setups when price makes a retracement or correction towards the upside. And when we are looking to sell, we will obviously look to sell at expensive valuations or at higher prices. This means we should short above the mean threshold or in the premium zone. This is where prices are marked up above the fair value or equilibrium. Now, you can't just sell at random prices within the premium zone. It doesn't work like that. You need to sell at any of the prices of interest or the SMC reference points, which is already existing inside the premium zone for the best possible results. This will provide a high probability setup for us to work with. Now moving on, let us look at some issues with this concept, and we will also look at some of the common mistakes that traders make when using premium and discount zones. The truth is that most traders either rely too heavily on this tool to make informed trading decisions, or they use it in such market conditions in which it does not make any sense to use this tool. When using Fibonacci, you don't need to be Fib dependent or rely on the fact that when price drops into the discount zone, it should immediately begin to rise. And when the price rises to the premium zone, it should immediately stop and begin the downward movement. Keep in mind that price does not owe you anything, and the market does not move according to your whims and fancies. It is true that price takes into account premium and discount zones, but the higher the time frame, the stronger is the possibility of it working out for us. The most common problem with premium and discount zones is that on lower time frames that are below 15 minutes, this tool becomes less effective if the price is not in its full range. It is also worth remembering that price tends to change direction
even if there are these important zones on the way. So there is no real guarantee of a price reversal from these zones. While we believe that premium and discount are a great entry point tool, over-reliance on it can cause you to incur losses and also miss out on quality trade setups just because they are not premium or discount. So without conducting an in-depth analysis of prices using concepts like market structure, supply-demand zones, liquidity, etc., which help to get the idea of the market direction, it is not even worth choosing a Fibonacci tool to plot premium and discount zones. The other common mistake that traders fall into is using premium and discount zones in those markets or assets that are either extremely volatile or those which are trending strongly in one direction. A simple example is to choose a stock that tends to move in one direction over the long term but with a very high volatility. The price may fluctuate parabolically within an upward trend, and it will not even think about falling into the discount zone. So the price may not always follow the expected pattern when it is in the premium or discount zone, especially in short to medium term trends. Another mistake committed by the less experienced traders is that they go chasing premium and discount zones everywhere in the charts, and they will eventually end up on the wrong side of the trend. So do not chase premium and discount zones and do not go against the trend. And lastly, don't trade premium and discount zones within a consolidation zone. So it is important to note that there is no real magic in premium and discount Fibonacci tool. What matters most is the narrative, the story that the market is telling. Only with a clear understanding of the narrative can you use this zone as a framework for trading. This is where the significance of PD arrays come into play. PD arrays stands for premium and discount arrays. This is a central concept in SMC. An array is nothing but a specific arrangement of things. Now, premium discount array is crucial for understanding how the market has moved and how it might move in the future. It is like a detailed map of the market activity, showing traders where the price has been and suggesting where it might go. This array is particularly useful for identifying key levels of support and resistance, as well as potential entry and exit points for trades. PD arrays focuses on the analysis of price levels in terms of their relative value compared to the market's perceived fair value. In a PD array, price points are categorized as either premium or discount. Premium prices are those considered higher than the market's perceived fair value, indicating a potential overvaluation, while discount prices are seen as lower, suggesting an undervaluation. You already know how to plot these premium and discount zones. And as a matter of fact, you also know that this method of categorization allows traders to gain insight into the potential market turning points by identifying where the market might switch from a state of overvaluation to undervaluation and vice versa. But PD arrays are more than just premium and discount zones. This is a multifaceted analysis that helps traders to not only see what the market is doing, but also understand why it is doing so, thereby enabling more informed and strategic trading decisions. PD arrays also take into consideration some array items or reference points. Specifically, there are 7 array items or institutional reference points that we need to consider in a PD array. In ICT methodology, these reference points includes old highs and old lows, order blocks, rejection blocks, mitigation blocks, breaker blocks, fair value gaps, and liquidity voids. Old highs and old lows refers to the swing highs and swing lows that can act as potential resistances or support levels for prices respectively. Due to this reason, there will be liquidity in the form of retailer orders available beneath these levels. So old highs and old lows are potential areas where the smart money can manipulate prices to absorb the liquidity and then reverse the market direction. Other than this, I have given you detailed explanation on each and every single topic. You can watch and revise them by going to the SMC playlist. Now, there is a particular order or hierarchy or relevance by which each of these array items are organized within a PD array. But before I tell you the hierarchy of array items, I want you to remember that
You need to conduct your analysis on your higher time frame charts no matter what trading style you follow. It could be swing, intraday, positional, etc. But this primary analysis should be done on your preferred higher time frame. This will definitely improve the quality of the trade signals. Once you receive a good setup, you can always move down to your lower time frame charts to optimize your trade entries. Now, let us look at the order of relevance of discount array items. We will only consider the discount zone when our trading bias is bullish. So for remembering this with ease, we can also call it a bullish discount array. Here, I have listed the bullish discount array items in the order of their relevance or hierarchy. So the most relevant institutional reference point is the old low, followed by a bullish rejection block, then a bullish order block, a bullish fair value gap after this, followed by a bullish liquidity void, a bullish breaker block thereafter, and the least relevant item is the bullish mitigation block. The hierarchy or relevance of fair value gaps and liquidity voids can be interchanged. Now, even though the relevance of these array items are in this particular order, we should start looking for these reference points in the opposite order. That is, we need to start searching for a bullish mitigation block first, followed by a bullish breaker block, and so on. There is a simple explanation as to why the relevance is in this order, but when looking for opportunities, we should go in the opposite order of the hierarchy. Look at this figure. I have marked some of the 7 reference points within a discount zone. Now, what do you notice? We can see that the old low is the lowest of all array items, located at the end of the discount zone. The next item is the bullish rejection block, followed by a bullish order block, a liquidity void, and a few fair value gaps within it. You can notice that one of the fair value gaps is closer to the equilibrium zone. It is clear that the reference points are arranged based on how cheap the price can become when compared to the mean threshold. So higher the relevance of an array item, the cheaper the price is available in the discount zone, which increases a trader's profitability and improves his chances of success. But you might already be aware of the fact that price will not pull back all the way down to absorb the liquidity. Price needs liquidity to move. It doesn't matter from where it gets it. This means the probability of price returning back to sweep the old low or the rejection block in a discount zone is much lower. Prices might reverse from an order block or a fair value gap. This is why we should look for the least relevant array items first, which is situated closer to the mean threshold, and then only look for other reference points which are usually formed deep within the discount zone. Another point to note is that not all these reference points will get formed within a discount zone. There might be occasions where you might get only a bullish order block and a bullish fair value gap. But there might be other situations where you might encounter a majority of these reference zones. So the idea is not to force yourself into finding these reference zones. If it is there, it will be visible to you. If it is not there, don't go searching for a ghost that does not exist. Now, once price trades below equilibrium, and if the overall narrative is bullish, it sets up buy conditions. You can look for long trading setups from these reference areas within the discount zone as it increases the probability of a successful trade. These reference areas are where buyers might step in to drive prices up from these discounted levels. These setups are identified when the price returns to the discounted conditions, allowing you to buy at favorable prices. Moving on, let us look at the order of relevance of array items in a premium zone. It is also called a bearish premium array because our bias is to go short in the market. Here, I have listed down the array items based on their hierarchy in a premium zone. So the most relevant institutional point on the sell side is the old high, followed by a bearish rejection block, after which comes a bearish order block, a bearish fair value gap thereafter, followed by a bearish liquidity void, and then a bearish breaker block, and the last reference point is the bearish mitigation block. Here also, the relevance of liquidity voids and fair value gaps can be interchanged. Now, just like the previous case,
we should start looking for the lowest array items in terms of priority, because the price will not always retrace all the way back to grab the liquidity. It can sweep the liquidity available anywhere in the bearish premium array and then reverse lower. So start looking for the mitigation blocks first, followed by the bearish breaker blocks, the liquidity voids, and so on. Also, not all these array items get formed within the premium zone. So don't just assume things. Follow what you have learned and apply it. If it is not there, it is not there. As simple as that. The same concepts apply to short setups as well. When the market takes liquidity, forms a swing low, and trades above the equilibrium region, you can wait for institutional reference points like bearish fair value gaps, bearish order blocks, etc. These reference zones are where sellers might dominate, pushing the prices down from these premium levels. If the overall bias is bearish, you can take a short trade entry, which will present you with a high probability trade setup. So these are all the important things that you need to know about premium and discounts. It is important to keep in mind that premium and discount concepts should be used as a part of a comprehensive trading strategy. Traders should consider other factors such as market structure, supply and demand zones, and liquidity before making trading decisions. These concepts provide additional insights and can enhance decision making, but they should not be relied upon as the sole basis for entering or exiting trades.
Take a look at these series of ranges that were formed and get shifted on the chart as the market moves to new price territories. What is it that you observe here? To be frank, this is a very important concept in SMC that you need to master in order to get your daily bias right and also to optimize your trade entries such that you buy at discounts and sell at premiums. So the main concept that I'm going to talk about in this video is regarding dealing ranges, and I will talk about displacement ranges also. So in this video, we will focus on dealing ranges, its key elements, its identification, potential trading setups that you can use, and then we will discuss displacement ranges and its identification and applications. Okay, let us first understand what dealing ranges are. We all know that SMC trading style focuses mostly on market structure and liquidity. Within the market structure, the dealing range is a concept where both buy side and sell side liquidities are taken out. A dealing range is simply a price range between a swing low and a swing high that takes out both the buy side and sell side liquidities. And it doesn't matter if this liquidity is a major liquidity or a minor liquidity. We will talk about this in a bit. But before that, let us understand the intention behind such range formations. Trust me when I say this, dealing range theory or DRT is one of those SMC concepts that you need to master as a trader, especially if you are a beginner. The reason why I say this is because dealing ranges can help you wait for the right setup to form before taking a trade entry. Within the dealing range, the smart money institutions are focused on accumulation and distribution campaigns. These institutions have deep pockets and detailed data to track where the majority of liquidity sits within the swing highs and swing lows. Institutions and smart money use such ranges to manipulate retail traders. They manipulate price action, drive liquidity hunts, and influence major price movements. In fact, the market primarily moves between the dealing ranges to balance fair value gaps or to hunt liquidity by breaking highs and lows within these ranges. These smart money institutions are aimed at building positions at specific levels of premium and discount zones of a dealing range. We will come to this concept soon enough. Now, to better understand a dealing range, mastering the following elements is critical. These includes the market structure, liquidity, and premium and discount arrays or PD arrays. I have extensively covered all these topics in the previous season of the SMC course. I suggest you go back and watch them to brush up your memory. In short, when drawing the market structure, the dominant trends swing high and swing low are typically identified. The most important element in the swing low estimation is the breakout structure, and that in the estimation of swing high is the price retracement below an inducement level for a bullish market structure. Likewise, the breakout structure is the most important element in the estimation of a swing low, and for the estimation of a swing high, it is usually the price pullback above the inducement level. The change of character or market structure shift is another important element of market structure that signals a change in the dominant trend's nature. But one of the key components of dealing range is selecting the proper swing highs and lows. Now, the second thing you need to have a good grasp on is the concept of premium and discount areas. The dealing ranges are divided into premium and discount areas. We will make use of the Fibonacci levels to mark the range. There are 3 levels in the range. These are 0%, 50% and 100% fib levels. The 50% fib level is considered as the equilibrium level. Now, in an uptrend, the discount area is below the equilibrium level and the smart money players are more likely to buy in this area. Similarly, in a downtrend, the premium area is above the equilibrium level and big players are more likely to sell in this area. Now, the most important component associated with the dealing range is liquidity and liquidity sweeps. So, as you may all know by now, liquidity sweeps are zones on the chart where large amounts of stop loss orders and pending orders accumulate, often forming within and outside of a dealing range. There are internal and external range liquidities. External range liquidity is the liquidity associated with the major swing highs or lows, while the internal range liquidities are associated with fair value gaps, order blocks, equal highs or lows, and internal highs or lows within the range. Liquidity is also classified into buy-side and sell-side liquidities based on where the orders are accumulated and what type of orders are accumulated near a level. Now, with an understanding of the main components that make up a dealing range, let us learn how to identify one. By definition, a dealing range is simply a price range between a swing low and a swing high that takes out both the buy-side and sell-side liquidities. We will begin with a bullish scenario. Like always, we will begin our analysis on a higher time frame chart. This is a 1 hour time frame chart that you are looking at, and the trend is bullish. Now, the most important point you need to keep in mind while looking for a dealing range is that your focus should be on the current price and not on the historic prices. This means you should focus on what the market is currently doing. Once you have that sorted out, you need to find the proper swing high and swing low for marking the dealing range. Now, the reason why I said proper is because you need a swing low that has already taken out a sell side liquidity, and you also need a swing high that has already taken out the buy side liquidity for marking a valid dealing range. For this, you need to check the new swing highs and lows with the previous swing highs and lows. So basically, we want the new swing low to take out a sell side liquidity pool. Since we are in a bullish market structure, we know that the old swing lows are considered as strong lows, which means the probability of price moving below these lows to sweep sell side liquidity is very low. So what are the other areas where we can expect to find sell side liquidity? Quite obviously, these include the equal lows and the internal low levels. We will find clusters of retail sell side liquidity below these areas. Now you can ask me, why not the fair value gaps and order blocks? Why are they not considered? If you have asked this question, then you are very sharp. So even though both order blocks and fair value gaps are considered as internal range liquidity, these are quite different from buy and sell side liquidities. To be more precise, fair value gaps highlight areas where price moved too fast, thereby skipping the liquidity, or it is simply an imbalance in prices that the market would return back to fill. Order blocks, on the other hand, show areas where institutions placed large orders. They represent institutional buying and selling zones. Now, when it comes to buy side and sell side liquidity pools, it represents areas where the retail traders have placed their stop losses and limit orders. Simply put, it all comes down to how the institutional players interact with these areas. Order blocks and fair value gaps are cost-based, meaning they show where the institutions acted or where imbalances occurred, while buy or sell side liquidity is effect-based, meaning they show where the retail traders are most vulnerable.
So the point I want to make is that fair value gaps and order blocks are not the liquidity areas we are looking for. Instead, these are potential trading zones within a dealing range where we can plan our entries. Now, the buy and sell side liquidities can be found above equal highs or internal swing highs and below equal lows or internal swing lows respectively. The new swing low should either take out the liquidity below an old low or previous swing low, or else it should sweep the sell side liquidity clustered below an equal low or an internal low level. Then we need a swing high that sweeps the buy side liquidity. In a bullish market trend, we normally get a liquidity sweep above the previous swing high in the form of a bullish break of structure. Now, a break of structure in itself doesn't tell us where the swing high is. It does help out in figuring out where the swing low is. But to determine a swing high point, we need to make use of the concept of inducements. In fact, inducement is a concept that has multiple benefits when it comes to the identification of a dealing range. Simply put, inducement is considered as the first pullback after a break of structure has happened. Now, there may be different scenarios where we need to tweak this concept of inducement. For instance, in a strong bullish trend, price won't always retrace deep enough. In such cases, the level below the latest minor pullback that the market forms on the way up is just an inducement level. Likewise, there are occasions when market will not even form a pullback after a break of structure. Instead, there will be a minor pullback before the break of structure happens. In that case, the low below this minor pullback level will be our inducement level. But no matter what the situation is, we can consider a retracement as a valid one only when an inducement level is swept. In addition, only when an inducement level is swept can we properly determine our swing high level. So in this bullish scenario, we want to see price retracing below an inducement level to sweep the sell side liquidity available there. This does two things. First, we can confirm our new swing high level, and second, we get a sweep of our sell side liquidity. Now we have the swing high and swing low that we have been looking for, which has swept the liquidities on both buy and sell sides. Now to properly mark our dealing range for trading, we can make use of Fibonacci levels. So let's select the Fibonacci retracement tool from the left sidebar menu or from the favorite tool section in TradingView. Now start plotting from the lowest swing point and drag and select the highest swing point. Your Fibonacci levels will be plotted automatically. But we do not actually need all these levels. We just require the 0%, 50% and 100% Fib levels. You can go to the settings and change it accordingly, or you could save it as a template for easier access. Here I will use my save template. So this is our bullish dealing range. The high is called the dealing range high and the low is the dealing range low, while the 50% Fib level is the equilibrium level. Now, can you tell me why we did this? This was done simply to identify the premium and discount areas within the dealing range. So as a rule of thumb, if our bias is bullish, it would be ideal to take long trades from the discount zones. And if our bias is bearish, it would be ideal to take short trading opportunities from the premium areas. So the simple idea is to buy low and sell high. Now in this particular case, since we have a bullish market structure, we will wait for prices to fall back to the discount area of our dealing range. This means we can look to take long trades below the 50% Fibonacci level. But taking trades anywhere below the 50% Fib levels seems vague. So you need to make use of bullish PD arrays within the discount zone. It could be the old highs or lows, order blocks, liquidity voids, fair value gaps, breaker blocks, mitigation blocks, rejection blocks, etc. But primarily, I like to make use of fair value gaps and order blocks for trade entries. It's strictly personal. You can use what works for you. Now, fair value gaps represent imbalances in prices. These market imbalances will act like magnets, attracting prices towards it. You could also look for order blocks along with fair value gaps within the discount area of the dealing range. Now, once you have identified a fair value gap within the discount zone, there is a very high chance that prices would pull back deep enough to fill these imbalances completely or partially. Now, this is not 100% guaranteed. There are occasions
where price could keep heading higher without retracing back to these discount zones. In such cases, the best course of action is to either wait patiently or else try using displacement ranges to ride short-term pulses. We will talk about displacement ranges in a short while. Now here, you can see the price retracing into the discount zone of our dealing range, and then it mitigated a fair value gap and started to reverse back higher. You can enter a long trade either from the high of the fair value gap or from the consequent encroachment level. You can then set your stop loss below the low of the fair value gap or even below the lower swing level. Our profit target would be the next draw on liquidity, which in this case is the previous swing high where buy-side liquidity is present. But you can significantly improve your odds of getting into a profitable trade by using the lower time frame market structure shift. I have talked about this in the recap episode of this season. The idea is to use the fractal nature of market. So if you are looking at the market structure in a higher time frame chart, such as the 15-minute chart, then you should switch to a lower time frame chart, such as a 1-minute or 3-minute time frame chart. Now you'll be able to see the fractal nature of prices. Most probably, you will observe price forming lower lows and lower highs during the retracement or pullback move. Now all you have to do is to wait for a change of character or a market structure shift in this lower time frame structure. But make sure that this shift in structure towards bullish price movements happen within a price of interest like a fair value gap or order block. So when you align your long trade entry with a market structure shift and a price of interest, you will get a high reward low risk setup. In this case, take the long trade entry after the bullish change of character. You can place your stop loss below the lowest point before the market structure shift happened. Your take profit level would be the next draw on liquidity on the higher time frame structure. In this case, it would be the next swing high where the external buy side liquidity is present. I hope things are making sense. Now let's see what the price did. The price moved higher, broke above the old swing high to sweep the buy side liquidity, thereby forming another bullish breakout structure. So now our swing low is confirmed, which has already taken out the sell side liquidity available below the previous inducement level, which was a minor swing low level. The price has then swept the buy side liquidity also. Now all we need is for the price to take out the inducement level such that our swing high is also confirmed. This way we can get the high and low of our new dealing range. You can use a Fibonacci retracement tool to plot the premium and discount areas within this new dealing range. Now our focus should be to take long trades from the discount zone by utilizing the PD array components like bullish fair value gap or bullish order block. Now a bonus tip here. When price retraces down during a bullish market structure, it could take out multiple sell side liquidity pools clustered below minor swing lows or below equal lows. This is more prominent if you are doing your analysis on a much lower time frame, such as 15 minutes for the purpose of intraday trades. No matter what the situation is, what matters is that the swing low formed should have taken out some sort of sell side liquidity. Another point to keep in mind is that the price could pull back deep enough to sweep the sell side liquidity below the major swing low, but it should not break and close below the low. In such a case, it is an indication that our main trend has shifted from bullish to bearish, and this is a bearish change of character. In that case, our previous dealing range gets invalid and we need a new dealing range that aligns with the newly formed trend. But I won't be talking about a bearish scenario because the process is the same. All you need to do is to identify a swing high which has already taken out a buy side liquidity above an old high, internal high, or an equal or relative high. Then you need to figure out a swing low point formed after a bearish breakout structure which has swept the sell side liquidity. You can make use of inducements for this purpose. Once an inducement level is swept, your lower low gets confirmed. Then use a Fibonacci retracement tool to draw a bearish dealing range from the swing high to the swing low point. The area above 50% Fibonacci level is our premium zone and below the equilibrium is our discount zone. Since our bias is bearish, we will look for short trade entries from within our premium zones
with the help of any of the 7 PDRA elements. It could be from a bearish fair value gap or from a bearish order block, etc. Now let me quickly walk you through an example on how to draw dealing ranges and how to shift dealing ranges in a bullish market scenario. So here we have a bullish structure on a 1-hour time frame. So here you can see that the market created a bullish breakout structure and swept the buy side liquidity. But before that, market swept the sell side liquidity below a minor low, which turns out to be an inducement level. So after the breakout, the lowest point which took out the sell side liquidity will be our dealing range low. Now after the structure break, price formed an inducement in the form of first pullback, and then price came back down to sweep the sell side liquidity below this inducement low. Now our dealing range high is also confirmed. So we can plot a Fibonacci retracement from the low to the high point to get the premium and discount zones of our dealing range. You could look for bullish trade entries from any PDRA element within the discount range of this dealing range, such as a fair value gap or order block. Now once again, price moved up higher to break above the previous high and swept the buy side liquidity. This will confirm the low of our new dealing range. After a bullish breakout structure, wait for an inducement to be taken out to validate a new dealing range high. Once again, using a Fibonacci tool, plot the premium and discount areas. This will be our new dealing range. In this case, price didn't move deep into the discount zone because there was sell side liquidity on offer below a minor consolidation, and there was also a fair value gap close to the equilibrium zone. But the important thing here is that the price has swept the sell side liquidity. Then again, the market moved higher, formed a structure break, and took out the buy side liquidity. The dealing range low is confirmed. When the inducement is taken out, our dealing range high also gets confirmed. Plot the new dealing range using Fibonacci. In this case, price retraced deep enough, taking out all the internal sell side liquidities near the minor lows, and then moved even lower to sweep the sell side liquidity below the previous low, and then only it reversed. So the point that I want to make is that despite having order blocks or fair value gaps on the way, there is always a possibility that the market could break past all these zones and draw into the external pool of liquidity. Now again, the price moved higher and it swept the buy side. Our dealing range low is confirmed. Then the market retraced to take out the inducement. The high of the range is also confirmed. Now mark the dealing range and wait for the price to pull back into the discount zone for you to enter into a long trade position. In this case, price took the sell side liquidity below the inducement level, moved lower into the discount zone of our dealing range, and then reversed higher after mitigating a fair value gap. Now using this technique, you can mark dealing ranges for the rest of the chart also. I recommend you try this out on your own on multiple charts to see if it actually works for you. Now let's say there is a bearish change of character. In that case, our bias has shifted and we will only look for bearish dealing ranges. Now let's quickly talk about displacement ranges. You may be familiar with what displacement moves are. Simply put, price displacements are large impulsive moves formed by large bodied candles with minimal retracements or wicks, often leaving fair value gaps or liquidity voids behind. These displacement moves confirms institutional intent in taking prices higher or lower depending on the market sentiment. If you have understood what displacement moves are, then figuring out a displacement range won't be a challenge at all. Just identify a displacement move, such as this in prices, then connect the lowest and highest points in the displacement move with a Fibonacci tool. By doing so, you can get an idea about the premium and discount areas within the displacement ranges. Let us understand this with the help of a bullish displacement range. Usually, a displacement move occurs in the market when price has swept some form of liquidity. It could be an external or internal range liquidity, and the candles associated with the displacement move are strong bullish candles with large real bodies with little to no wicks. So we need to spot such a series of strong bullish imbalance candles. Then you need to identify the starting point or the low of this bullish displacement move and you also need to mark the high of this displacement move. Now use the Fibonacci tool to connect the lowest and highest point of the displacement move. We only require the 0%, 50% and 100% Fib levels. Now this becomes our displacement range. Similar to dealing ranges, here also the area below the 50% equilibrium level is the discount zone and above the 50% is the premium zone. Now what should we do with this range? The idea is to wait for the price to pull back at least to the 50% Fib level or to the discount zone. During a bullish displacement move, price would have created bullish fair value gaps on the way up. We can anticipate a price retracement to these imbalances to fill these imbalances completely or partially. So we can try to take long trade entries from or below the equilibrium level. Now for optimizing your trade entries, you could also move down to your lower time frame chart and look for a bullish market structure shift after the price pullback to confirm a reversal in the actual trend direction. Once this is confirmed, you can take your long trade entry and you can keep the stop loss below the lowest point before the minor structure shift happened. And our first target in this case would be the displacement range high. Now, one interesting thing about displacement ranges is that it is either formed within a dealing range or else it could be equal to the dealing range. Either way, just like with dealing ranges, we will only consider the most recent price action for plotting displacement ranges. So once our displacement range is done and dusted, it is no longer useful and we will have to shift to a new displacement range as and when it occurs. Now the same concept applies to bearish displacement ranges as well. So most probably you will find bearish displacement moves during a bearish market structure. Once you have identified the displacement move with strong bodied bearish candles, you can now connect the highs and lows of this displacement move using a Fibonacci tool that will split the range into two zones. The area above the 50% Fib level is the premium zone, while the area below it is the discount zone. Since the overall market sentiment is bearish, we will look for short trade opportunities when price retraces back at least to the equilibrium level or into the premium zone. You could refine your trade entry by moving down to a lower time frame chart and wait for a bearish structure shift to happen within the premium zone. You could enter a short trade and set your stop loss above the highest point before the minor structure shift happened. Our initial profit target would be the low of the displacement zone. I hope things are clear now. So this is all you need to know about dealing and displacement ranges.
Once you complete each episode, I want you to go back to your favorite charts and apply what you have learned. I want you to select the highest time frame for your chart analysis based on your trading style. Once that's done, I want you to mark the market structure. That is, identify the major swing structure and the internal structures. Then, I need you to figure out where to find the internal and external liquidity areas and see how the price reacts in these areas or zones. Further, I want you to identify and mark the major SMC reference areas. These reference areas could be order blocks, fair value gaps, rejection blocks, liquidity voids, etc. And finally, based on the market structure and the trading bias, you need to identify the premium and discount areas within a particular swing. This is how the entire SMC chart analysis process looks like in brief. As a beginner, you need to keep identifying and marking them manually. This will help cement the concepts in your head. The trade entry process is yet another topic of discussion which we will cover in the second season of SMC course. Now, analyzing multiple charts can turn out to be time consuming and cumbersome. So we require some help. This is where indicators come into picture. So in this video, I will be talking about a few very useful and effective SMC indicators that will release a lot of burden when analyzing charts. Keep in mind that all the indicators that I will introduce to you are available for free in TradingView. Before I talk about the SMC indicator, I would like you to select the highest time frame depending on your trading style. This time frame selection will vary from one trader to the other. If you know your trading style, but you are unable to choose proper time frames, I suggest you watch my detailed video on how to select time frames accordingly. I am predominantly a swing trader, so the higher time frame for my analysis is usually the 1-day time frame. And if you are someone who trades intraday positions, you can choose your higher time frame as the 1 hour or even the 15-minute time frame. Once that is done, you will notice a problem in the chart. This is commonly observed in most Indian stocks and indices. It is nothing but price gaps. These gaps are a result of overnight market sentiment. These gaps become annoying when we start to mark the market structure. It does not provide a continuous price action, due to which structure mapping can get a little bit complicated. So, a simple workaround this issue is to use an indicator. Keep in mind that in forex and crypto markets, there is no requirement of this indicator as the price is continuous as the market is open almost 24/7. Now, let's take a look at this indicator. So open TradingView in your browser or app, then open the chart you want to analyze. For this case, I will choose the Nifty index. Then I will select the 1 hour time frame, and you can see a lot of gap formations in the chart. Now go to the indicators icon and click on it. A pop-up menu will appear on your screen. On the left side of this menu, select the section named Technicals. Now on the search bar, type in no gap candles and then hit enter. You can see there is only one indicator available in that list, which is created by Ichipata. Just click on this indicator. Now go back to the chart and you can see how the gaps are automatically filled by extending some candles. Keep in mind that this indicator should not be used while trading or taking a position in the live market. This indicator should be used just to make the structure mapping process easier if you are a beginner or if the chart is too much crowded with price gaps. I will turn this indicator on and off so that you can see what really happens in the chart. You will instantly notice that gaps are filled just by extending one of the candles. So there is no real logic in doing so. Therefore, make sure to switch off this indicator once you have completed marking the structure. Now, if you go to the settings of this indicator, you will find that there are not really many adjustments to be made. Just keep everything as default, but maybe you can change the colors so that you can easily recognize where the price gaps were. Moving on, there are a lot of smart money related indicators available in TradingView indicator section. But the indicators that are used by a large number of traders are the ones created by LuxAlgo. Just go to the indicator section and on the search bar, type in LuxAlgo and you will see hundreds of results showing up. There are some smart money related indicators, price action based indicators, and a lot of others. For the purpose of this video, our focus is only on smart money indicators by LuxAlgo. A special mention to LuxAlgo for keeping these indicators absolutely free for retailers. Anyways, I have starred or favorited some of the best SMC indicators by LuxAlgo. You can pause this video, take a screenshot, and type in the names and add these indicators to your favorite indicators section. These indicators provides a lot of flexibility for traders to choose only those concepts which are actually required for your trades. For example, if you want the indicator to spot potential order blocks and breaker blocks, then you can use the order blocks and breaker blocks indicator by LuxAlgo. But if you only want order blocks and don't want the indicator to spot breaker blocks, then you can select the order block detector indicator by LuxAlgo. And in case if you don't want the indicator to show order blocks but only spot breaker blocks, then use breaker blocks with signals indicator for doing so. So the scope of customization is endless. I won't go into each and every one of these indicators because it will then become a very long video and I don't want to waste your valuable time by talking about the indicator settings. It is actually not worth it. So I leave it up to you to play with these indicators. I think TradingView has now limited the number of indicators on the chart to just 2 for their basic plan. Now most beginners won't be able to afford TradingView subscriptions. Even I was not able to afford TradingView when I started out. For such people, using multiple indicators as a part of customization is not really a possibility. But fear not, there is an SMC indicator that is an all-rounder. It takes care of most of the useful SMC concepts, from mapping the external and internal structures to finding order blocks, fair value gaps, equal highs and lows, multiple time frame highs and lows, to figuring out the premium and discount areas. It will satisfy more than 90% of your requirements, and it will help quicken your chart analysis by multiple folds. The creator of this indicator is none other than Lexalgo himself. So go to the indicator section and on the search bar, type in smart money concepts. And in the results, you will instantly notice the first indicator by Lexalgo that is used by more than 40,000 traders. Just click on this indicator. It will automatically apply all the concepts on the chart. You will see a lot of markings like bows, chalk, equal highs, equal lows, strong lows, weak highs, order block zones, etc. After applying the indicator, the chart looks kind of crowded. So let's fix this. In order to do that, let us tap the indicator settings. Under the input section, you will notice a lot of options for customizing the indicator. Let us take a look at each one of them and understand what is what. So the first option says mode. By default, it is set to historical. If you click on the drop-down menu, there is another option named present. If you want to know what these options mean, just hover over or click on the I button on the right. It asks if you want the indicator to mark the historical structures also, or do you just want the recent structure formations. If you click on the present option, you can notice that all the previous markings are removed and only the most recent structure is marked. Personally, I like to keep this option set to historical as it gives me a general idea about the market trends and how it has played out in the past. The second option says style. By default, it is set to colored. Click on the drop-down menu and you will find another option named monochrome. Hovering over the I button, it says indicator color theme. If you select monochrome, every marking will be set to gray. It might help with keeping things simple, but if you want the markings to look more bright and colorful, choose the first option. It depends on your personal preferences. The next option is a tick box named colored candles. This option will color the candles based on the current trend as detected by the structure. Enabling this option also depends on your personal preference. The next section says real-time internal structure. This option displays the internal or minor market structure on the chart. The internal structure is not the major component in our analysis. But if you are someone who follows fast-paced trading styles, by entering and exiting positions quickly, grabbing only a few points, then internal structure might come handy for you. You have some customization options to change the color of the bullish and bearish internal structure markings, as well as filtering only bows or chalk or both. There is also a confluence filter that will filter out all the non-significant internal structure breakouts. For the time being, I will just uncheck the internal structure option. Once we do that, the chart becomes much more cleaner. Now, on scrolling down, the next section reads Real-Time Swing Structure. Enabling this option will display the major swing structure. You have a lot of controls available. First of all, you can decide whether you want the indicator to display just the bows or the chalk or display both. I will keep it as default. You can also change the color of the markings however you like. Then there is another tick box reading Show Swing Points. Enabling this option will mark the higher highs, higher lows, lower highs and lower lows. The default number is set to 50. You can increase or decrease this number to get the appropriate swing labels. The next tick option is to display the most recent strong highs or lows and weak highs or lows. This is also an important option, so keep it enabled. Keep in mind that the market structure mapping may not always be 100% accurate. There might be certain discrepancies, so make sure to double check the outputs. Now scroll down again. The next section is for order blocks. Here there are two options. One is for internal order blocks and the other option is for swing order blocks. The swing order blocks are considered as high probability, high reward to risk order blocks compared to the internal order blocks which are considered less effective. Both numbers are set to 5 by default. It simply denotes the number of order blocks to be displayed. You can change this number if you want. The next option says order block filter. By default, it is set to ATR. The drop-down gives an additional option to use the cumulative mean range as the filtering method. The I button clearly mentions that cumulative mean range is to be used only when the price data available is low, meaning this might come in handy on illiquid assets. Since our focus is only on liquid assets, we should keep the filtering method to the default setting of ATR. You also have the option to change the color of the order blocks so as to set them apart for easier identification. Now scroll down again. The next section is for equal highs and equal lows. Enable this tick box. Equal highs and lows help us figure out the market liquidity. The first option says bars confirmation and it is set to 3 by default. This is nothing but the number of candles used to confirm the equal highs and lows. More the number of bars required, lower will be the number of equal highs and lows marked, and vice versa. Keeping this number high can help us find more purposeful equal highs and equal lows. Setting this number to a very small value like 1 can basically return a lot of results on the chart, but they are noisy and less useful for us. So play with the numbers to find your sweet spot. The next option is threshold and it is set to 0.1. Not all equal highs and equal lows are formed perfectly. There will be some variations. This setting will help us account for this variation information and help us detect such equal highs and lows which are not perfect. Keeping a lower value like 0.1 can help us provide closer results and will return limited results. Keeping it to 0 will return perfectly equal highs and lows. Now when the sensitivity is increased to say like 0.5, it will return more results, but the variance of equal highs and lows formed will be higher. So try to keep this threshold value as low as possible. The next section is for fair value gaps. You already know what fair value gaps are, how they are formed, and how they work. Once the checkbox is enabled, the indicator will display fair value gaps on chart. The next option says auto threshold. Also enable this setting as it will filter out all those failed and mitigated fair value gaps which are not significant anymore. There is also an option to select the time frame in which the fair value gaps get formed. By default, it is set to the chart time frame. If you want the indicator to show fair value gaps from some other time frame for the purpose of taking confluence trades, then it is very much on the cards. You can also change the color of imbalances. Also make sure to extend the fair value gaps so that it is visible clearly. Turn up this number to 25 or 30 or more. On scrolling down, the next section is to select the multiple higher time frame highs and lows. Options for daily, weekly and monthly highs and lows are available. Enable all of them to get a reference of where the price is with respect to these levels. It gives an idea about overvaluation and undervaluation of prices. The last section says premium and discount zones. Once enabled, it will show the most recent premium and discount zones within a particular price swing. Keep in mind that it will not mark the PD arrays. It will only display the premium, discount and equilibrium zones to give you a general idea of where the price is trading at. Is it cheap or is it expensive? So that is all the input customization settings in this indicator. I would not say that the indicator is perfect and every marking is 100%. So make sure you double check everything. And if you have some knowledge on PineScript, the source code is also available for free and you can make changes to customize the indicator according to your requirements. You can also check out the other favorited smart money indicators and decide upon which ones to use. I hope this video will make your smart money analysis easier.
I'm going to cover one of the most widely used indicator that traders use for technical analysis and for trading. It is none other than the Fibonacci tool. Now you may have heard of Fibonacci even from your school days and in many other fields other than trading. This is because it has many interesting properties and has a variety of applications in different fields like mathematics and science. It is really an interesting topic of discussion. But what is more interesting is its role when it comes to financial markets.
Fibonacci is a powerful tool that can forecast future price movements, and it can give you potential levels where you could take your entries or exits. So this is going to be a complete course on the Fibonacci tool, and as always, I will start from the very basics of Fibonacci. Then I will discuss the important Fibonacci numbers and how they are calculated, followed by the importance of Fibonacci ratios and the golden ratio. And then we will understand why does the Fibonacci concept work while trading in the financial markets. Then I will talk about the most important Fibonacci tools that traders must be aware of, starting from the Fibonacci retracement, Fibonacci extension, and Fibonacci expansion. And not to mention, we will go in depth into how to use these Fibonacci tools for trading. So make sure you watch the video till the end without skipping, so as to get the complete understanding of the entire concept. So fasten your seatbelts because this is going to be a fun ride. Let's start from the grassroots level. What is a Fibonacci sequence and where did it originate? Leonardo Pisano Bogolo, an Italian mathematician from Pisa, is credited with the discovery of Fibonacci sequence way back in 12,002. The Fibonacci sequence that you can see on the screen goes like 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, and the sequence goes on. Okay, let me make it clear that I will not dwell deep into the mathematical properties behind the Fibonacci sequence, but I will give you the basics that will provide you with necessary background of the sequence. Now, how to make sense out of all this? How are the numbers in the sequence formed? Now, it's very easy. Now, each number in the sequence is formed by adding the two consecutive numbers before it. So, if you add 5 and 8, you will get 13, which is the next number in the Fibonacci sequence. And if you add 34 and 55, you get 89, and the sequence goes on to infinity. But these numbers don't really mean anything for a trader, because the numbers that you see on a Fibonacci trading tool aren't actually the Fibonacci sequence themselves. As you can see, the Fibonacci tool in your charts consists of numbers like 0.236, 0.382, 0.618, 0.786, etc. So what exactly are these? The simple answer is that the numbers used in the Fibonacci trading tools are actually Fibonacci ratios and not really Fibonacci sequences itself. Now, what do I mean by Fibonacci ratios? So, if you divide a number on the Fibonacci sequence by any of the succeeding numbers, then we will get the Fibonacci ratios. So, if you divide two consecutive numbers on the sequence, then we will get the first ratio, which is 0.618. For example, if you divide 21 by the next number, which is 34, then you will get 0.618 or 61.8 when converted to percentage by just simply multiplying the ratio by 100. And if you divide two Fibonacci numbers with a gap between them on the sequence, then you will get the second ratio, which is 0.382. An example would be when 21 is divided by 55, you will get 0.382 or 38.2%. In a similar manner, if you divide any Fibonacci number by its preceding number, then we will get the ratio as 1.618. For example, if you divide 55 by 34, you will get 1.618 or 161.8%. This ratio is very popular and it is called as the golden ratio. Now, this ratio appears many times in geometry, art, architecture, nature, etc. The ratio is simply the inverse of 0.618 ratio. Okay, now that is the basic idea behind Fibonacci ratios and Fibonacci numbers. Now the question is how to use them to our advantage while trading. First of all, let me make it clear that there are many kinds of Fibonacci tools like Fibonacci retracements, Fibonacci channels, Fibonacci time zones, Fibonacci circles, Fibonacci spirals, Fibonacci wedges, and the list goes on. Which of these Fibonacci tools matters the most? And more importantly, how do you use these Fibonacci tools for trading so that you can get the best possible results? Now, despite a whole spectrum of Fibonacci tools out there, the most widely used ones are Fibonacci retracement, Fibonacci extension, and Fibonacci expansion. And to be honest, it is all you need. But before introducing each one of them in detail, let me tell you the reason why Fibonacci levels work in the real market conditions. It could be due to either of the two reasons. It may be due to the core mathematical principles supporting the Fibonacci numbers and their relation to natural geometrical structures found throughout the nature that makes them work in the financial market. Or you could just argue that it is simply due to the crowd mentality of people in the markets and the fact that so many traders watch these levels day in and day out and they trade them. So we can anticipate the price to behave in a particular manner near these levels. So if you ask me which one of them is true, well, I would say probably a bit of both. But the important point is that we don't really need to know for certain as to why it works. Moving on, let me now explain what Fibonacci retracements, Fibonacci extensions, and Fibonacci expansions are, and also show you how to apply them in your charts. Let's start with Fibonacci retracements. Now, the textbook definition of Fibonacci retracement goes like this. Fibonacci retracement levels work on the theory that after a big price move in one direction, the price will retrace or return partway back to a previous price level before resuming in the original direction. Now, if you think about it for a while, you will understand what it means. It is simply taking into consideration the swing nature or the wave nature of prices. That is, prices just don't go up and down all at once, but instead it moves in the form of swings or waves where there will be an impulse move followed by a corrective move. The impulse move is where the momentum happens, or it is the strong price move which happens with strong candles and it happens rather quickly, while the corrective or retracement move is the price move which is against the ongoing momentum, and it may be due to short-term profit booking by traders and is usually associated with weaker candles. So one of the purposes of Fibonacci retracement levels is to predict when the pullback or retracement or the correction will end, so that you can hope into an existing trend once again. Some traders even anticipate a trend reversal if the price manages to break certain retracement levels like 38.2 or 61.8 levels. So in short, traders use Fibonacci retracement levels as potential supports and resistance areas. Now, I'll talk about all these in a little while, but first let us learn how to plot Fibonacci retracement levels on our chart, and let's look at the important things to keep in mind while plotting these levels. See, Fibonacci retracement levels are actually horizontal lines that indicate possible support and resistance levels where the price could potentially reverse direction. Now, the first thing you should know about Fibonacci tool is that it works best when the market is trending. So the simple idea is to go long or buy on the retracement at any of the Fibonacci support levels when the market is uptrending. Or the idea is to go short or sell on a retracement at a Fibonacci resistance level when the market is trending down. So in short, we can think of Fibonacci retracement levels as a predictive technical indicator, since we are attempting to identify where the price might be in the future. Now, in order to find these Fibonacci retracement levels, you have to identify the existing trend in the market, be it an uptrend or a downtrend, and then you have to find the most recent significant swing highs and swing lows. Now, if you don't have any idea about price swings and trends, then you can watch my video on market trends, or you can even watch the entire price action course for much more clarity. Now, once you have identified the trend and the most recent swing levels, you can use the Fibonacci retracement tool to draw the required levels. For example, if the market is in a downtrend and you have identified the swing high and swing low, now you can go to the left side panel to access the Fibonacci retracement tool if you are using TradingView. Just select the Fibonacci retracement tool and then click on the most recent swing high that we have identified, and then simply drag the cursor to the most recent swing low and click once again, and we are all done. The levels will be automatically plotted. Now, why do we have to select the swing high first and then swing low for a downtrend? The reason is quite simple. It is because in a downtrend, the 100% swing move is measured from the recent swing high to the recent swing low. And if we draw the Fibonacci tool from the swing low to the swing high, then the retracement levels will get inverted, meaning that 0%, 23.6%, etc. will be marked near the swing high, and 78.6%, 100% levels will be marked near the swing low. And so a small upward retracement will now show a 78.6% retracement, which is not really true because it is actually just a 23.6% retracement. So it is important that you follow the correct way of drawing Fibonacci levels. That is, you always start from the origin of the impulse move. That is, for an uptrend, the origin is the swing low, and for a downtrend, the origin of the impulse move is the swing high level. Now for uptrend, you have to do the exact opposite. So first of all, you have to find the most recent swing low and swing high. And once you have done that, you have to select the Fibonacci tool from the left side panel. Then you have to select the origin of the impulse move. That is, click on the swing low, not the swing high, but click on the most recent swing low and then drag the cursor to the most recent swing high and click once again, and we are done. The levels will be plotted automatically. Now you can always go to the settings to adjust the parameters, colors, appearances and all that. You can also change the levels in terms of do we want it in decimal values or percentages. I personally like to keep it in percentages. So do check it out if you want to add or delete some levels. These settings would be particularly useful when dealing with harmonic patterns where some specific levels are required for certain patterns. And maybe we'll discuss this in one of our future videos. Now based on the depth of the levels, we can consider a 23.6% retracement to be relatively shallow. Such retracements would be appropriate for flag patterns or short pullbacks. Now, short pullbacks usually happen in strong trends where the corrective moves are very limited compared to impulse move. Now, retracements in the 38.2% to 50% range would be considered moderate, which is appropriate for pen and chart patterns. Even deeper, the 61.8% retracement can be referred to as the golden retracement, as it is based on the golden ratio. In those scenarios, you will find deep pullbacks, and deep pullbacks usually happen with weak trends where the corrective moves are more visible, similar to the ones that we find in the channel patterns. Now, let's take a look at some examples on chart as to how to apply the Fibonacci retracement levels and how price responds to these levels. As you can see, the price is trending up. So we will plot the Fibonacci retracement levels by first clicking on the origin, that is the swing low, and then dragging the cursor to the swing high. The charting software will automatically calculate and show you the Fibonacci retracement levels. Now this is the daily time frame chart of Reliance Industries. And as you can see from the chart, the Fibonacci retracement levels are plotted, and it includes 23.6%, 38.2%, 50%, 61.8% and 78.6%, etc. Now, you might find something odd here. Yes, the 50% ratio is not officially a Fibonacci ratio, but it was somehow able to sneak into the group and has never left. Jokes apart, to be precise, this number or percentage stems from Dow theory's assertion that the averages often retrace half their price move. I won't go into greater detail on this. Maybe I will talk about this when we take up Daw's theory for the discussion. Anyways, it is very useful to indicate the 50% of the price move, and usually the price respect it. So it is a good practice to keep the 50% level as it is. Now the expectation is that if the price retraces from the recent swing high, it will find support at one of these Fibonacci retracement levels because traders will be placing buy orders at these levels as the price pulls back. Now let's look at what happened after the swing high occurred. Price pulled back right through the 23.6% level and continued to stay over there for a few days. Then finally, the market resumed its upward move and eventually broke through the swing high. Clearly, buying at the 23.6% Fibonacci retracement level would have been a profitable long-term trade. Now let's take a look at another example, but this time for a downtrend scenario. Here the price is trending down, so we will plot the Fibonacci retracement levels by clicking on the swing high first and then dragging the cursor to the swing low. The software will automatically plot the retracement levels. Now this is the daily time frame chart of Tech Mahindra. Now the expectation of a downtrend is that if the price retraces from this low, it could possibly encounter resistance at one of these Fibonacci levels because traders who want to enter and play the downtrend at better prices are anticipating a pullback and may be ready with sell orders at these levels. The market did try to rally, but it started below the 23.6 level for a bit and then came back to test the 38.2% level. Now look what happened afterwards. The price continued the downward rally once it took the resistance at 38.2% level, where there could have been a good selling pressure. Now in these two examples, we observe that the price found some temporary support or resistance at Fibonacci retracement levels. So if enough market participants believe that a retracement will occur near a Fibonacci retracement level and they wait to open a position when the price reaches the level, then all those pending orders could impact the market price. But one thing you should understand is that prices won't always bounce from these levels. There are actually occasions when the price will just break through these levels and move in the opposite direction. Therefore, these levels should be looked at as potential areas of interest or potential areas of values and nothing more. Now, we have discussed in our price action course that supports and resistances eventually break. Well, from that perspective, Fibonacci levels are also potential supports and resistance levels. Therefore, this logic applies to Fibonacci levels also. This means that Fibonacci retracements do not always work. They are not foolproof and they are not 100% reliable. Now let's look at another example to prove this point. This is the daily chart of TCS. As you can see, the stock is trending down and we have identified the swing lows and swing highs. Now I will plot the Fibonacci levels. You can see that the price retraced to 23.6% level and then stalled at the 50% level for a couple of candles. At this point, many traders would think that the 50% Fibonacci level is holding and it is time to short its futures or options or whatever. But take a look at what happens next. It turns out that the swing low was the bottom of the downtrend and the price began to rally above the swing high point. So what's the lesson here? While Fibonacci retracement levels give you a high probability of success, like other technical tools, they don't always work. You can't actually predict for sure if the price will reverse from a level before resuming the trend. Sometimes it may hit 38.2% or 50% or even 61.8% levels before turning around. But there are also times when the price will just ignore all these Fibonacci levels and blow past all the levels just like it does not even exist. So always keep this in mind and be cautious. Now another problem in using Fibonacci retracement tool is determining which swing lows and swing highs to use. Now the problem mainly arises due to the fact that people like you and me look charts differently. We look at different time frames and have our own fundamental biases and beliefs. But the bottom line is that there is no absolute right way to do it, especially when the trend on the chart is not so clear. Sometimes it all becomes a guessing game. But one thing that I like to follow is to find the most recent swing high and swing low level, including the candle's wick. That way I can accommodate the entire price swing within these levels. But at the end of the day, it all comes down to how you like to use it. Now that we know how to draw the Fibonacci retracement levels and how to use it, let us learn a few methods as to how to combine Fibonacci with other indicators or tools to improve our odds in the market. In that context, we will talk about how to use Fibonacci retracements with supports and resistance levels in the market, how to use Fibonacci retracement with trend lines, how to use Fibonacci retracement with candlestick patterns, and how to use Fibonacci retracement with chart patterns. Let's start with how to use Fibonacci retracement with support and resistance levels in the chart. I am of the belief that even though the Fibonacci retracement tool is extremely useful, it shouldn't be used all by itself. This is true for any kind of indicator or analysis that you conduct in the market. You always need confluence. You always need more confirmations. And so, the Fibonacci retracement tool should be used in combination with other tools. And one of the best ways to use Fibonacci retracement tool is to spot potential supports and resistance levels and see if they line up with Fibonacci retracement levels. If Fibonacci levels are already support and resistance levels and you combine them with other price areas that a lot of other traders are watching, then the chances of the price bouncing from those areas are much higher. Let's look at an example of how you can combine support and resistance levels with Fibonacci levels. So as you can see, the stock has been on an uptrend. You can use the Fibonacci tool to mark up the levels. Now, if you observe closely, you'll notice that there is a strong level, or maybe I should say a range, which acted as a resistance before. But now, since the price has broken out, it will act as a support level, which is simply the concept of change in polarity. And to our advantage, this resistance turn support level coincide with the 61.8% Fibonacci retracement level. So if I were to take a long position, I would wait for the price to retrace or pull back to this particular level of 61.8, which is a confluence zone or a nested zone where the probability of a trade working out in your favor increases. And as you can see, the price did return back to test this level and went back up by giving us a decent return. You can do similar setups on downtrend as well. The point is, you should look for price levels that seem to have been areas of interest in the past, and support and resistance levels seem to perfectly fit into the box. With a lot of traders looking at the same support and resistance levels, there is a good chance that a huge number of orders are at those levels. Now, there is no guarantee that price will bounce from these levels, but at least you can be more confident about your trade. See, always remember that trading is all about probabilities. And if you can stick to those higher probability trades, then there is a better chance of you coming out profitable in the long run. Now, the second method is how to use Fibonacci retracement with trend lines. So, Fibonacci retracement levels work best when the market is trending. So, it makes a lot of sense to combine it with trend lines. This is an interesting application of Fibonacci retracement tool, which can help us forecast the next swing low in case of an uptrend and the next swing high in case of a downtrend, which is expected to be a part of the trend line. Let me explain. For example, the price has been respecting a short-term ascending trend line or an uptrend line. So you are planning to take a long entry on the next swing low into the trend line. But before the price even tests the trend line again, what you can do is that you can plot the Fibonacci retracement levels from the previous swing low to the most recent swing high, so that you can forecast beforehand as to which level you can expect the price to retrace. Notice how the 50% and 61.8% Fibonacci levels are intersected by the rising trend line. We'll also observe if any of these levels will act like a support level. And guess what? The 61.8% Fibonacci level held, and it acted as a support level not just once but twice, and the price bounced from it both times. But since we are looking for confluence and high probability setups, we will only take an entry when the price tests the 61.8% level and the trend line. Now, this would have been our perfect entry and an even perfect trade. You can adopt this process throughout the entire trend. You can also use this method in case you are eyeing a downward trend. But the only difference is that you will be looking to forecast the swing high instead of a swing low. Now let's look at the third method, which is using Fibonacci retracement with candlestick patterns. Now, when combining Fibonacci retracement tool with candlestick patterns, we are actually looking for exhaustive candlesticks, which can tell you if the buying or selling pressure is exhausted. And it can also give you a clue as to when the price may continue trending or when it is weakening. Now, the exhaustive candlesticks that we are interested in are pin bars with or without a real body. Now, the long upper or lower wicks represent price rejection, and it indicates a potential shift in the momentum and market sentiment. Now, take a look at this example where the price moves with strong momentum towards the upside. Then we plot the Fibonacci retracement levels. We can notice that the price retraced back to the 23.6% level. At this point, you might have this doubt in mind, since the price has moved up so much, there might not be enough momentum for the price to move upside. And so you might anticipate the price to retrace even lower, or in fact it could even reverse for that matter. But then something interesting happens. The retracement stalls with an exhaustive pin bar candle with a very long wick, which rejects all the lower prices, indicating that the sellers are weak, or in other words, the buyers are still dominant. So at this point, you can look to take a long trade when the price starts to move higher. It would earn you some decent returns. You can always improve your odds if you add support and resistance levels into the mix, and then you get more confirmations on your trade. Now the last method is to use Fibonacci retracements in conjunction with chart patterns like pennants, flags, wedges, etc. I have already discussed this topic in detail in my chart patterns course, so you can check that video out to know more. But to briefly remind you, chart patterns like flags usually have narrow retracement, usually between 23.6% and 38.2%, while patterns like pennants have much deeper retracements between 38.2% and 50%. Now, the trade entry, stop loss and targets will be based on the pattern and not really based on the Fibonacci tool. Now that you have an idea on how to use Fibonacci retracement levels to find confluence setups, the next thing you might have in your mind is when to enter and where to set the stop loss. Well, the context is very straightforward. You could set your stop loss just past the Fibonacci retracement level. Let me explain. So if you are planning to take a long trade at 38.2% Fibonacci level, then you would place your stop loss beyond the 50% level. Or another case, if you feel like the 50% level would hold, or if you take a trade from 50% level, then you would put your stop loss past 61.8% level, and so on and so forth. It's simple, right? So in a similar manner, if you have shorted at 50% level, then you could place your stop loss order just above the 61.8% Fibonacci level. Now the reasoning behind the method of setting stop loss is that you believed that 50% level would hold as a resistance level. Therefore, if the price were to rise beyond this point, your trade idea would be invalidated. Now, the problem with this method of setting stop loss is that it is entirely dependent on you having a perfect entry. And setting a stop loss just past the next Fibonacci retracement level assumes that you are actually confident that the support or resistance area will hold. And as pointed out earlier, using drawing tools is not an exact science. So usually this method is good for stop loss placement based on short-term and intraday trades. Now if you're planning to trade a support, resistance and Fibonacci confluence setup, then you can take a trade entry when the price starts to resume in the direction of the trend from the area or level of interest. And your stop loss can be either placed beyond the next Fibonacci level, as we have mentioned earlier, or you can set the stop loss below the support level or above the resistance level with suitable buffer using a volatility indicator like ATR, depending on your trade direction. And in case if you have considered an exhaustive pin bar candlestick for your trade, then you might be better off taking a trade when the price crosses the pin bar in the direction which you want to trade. So if you are looking to go long, then buy when the price breaks above the high of the pin bar candle and set the stop loss below the exhaustion pin bar. Or if you are looking to short, then take a short trade when the price breaks below the low of the pin bar candle and place the stop loss above the high of the pin bar candlestick. Now the same logic applies if you are taking trades from trend lines. In this case, you have to set your stop loss with a suitable buffer with respect to the trend line. Now let's move on to the next topic, which is Fibonacci expansions and Fibonacci extensions. Now most of the time, traders get confused as to what is what. Now most of us might not even know both of these exist. And there are some of them who believe that both of them are the same. So let's address all these issues and discuss in detail what both of these Fibonacci tools are and what it does. Both these tools are used by traders to predict how far a trend will go, or maybe you can think of these levels as potential targets or exits for traders who have taken a trade from any of the retracement levels. I know you have questions. I know you want to know how both of them are different. How can we apply these tools in the charts? Should we include wicks, or is it just the body that we should consider? So let me keep things as simple as possible. Since we use Fibonacci retracement tool to time pullbacks, and since we want to measure the whole trending move, we start from the origin of an impulse move, and that includes the wicks of the candles also. Now it's similar to the Fibonacci extension and expansion tools as well. We require the entire price swing, so we will consider the lowest and highest wicks of the candles also. Now let me start off with the Fibonacci extension level, which is rather the more commonly used Fibonacci tool. To draw the Fibonacci extension levels, we require 3 points: a swing high, a swing low, and a retracement level. Let's start with an uptrend. In an uptrend, the general idea is to take profits on a long trade at a Fibonacci price extension level. First, select the trend-based Fibonacci extension tool from the left side panel if you are using TradingView. As I have mentioned earlier, you can determine the Fibonacci extension levels by using 3 mouse clicks. First, click on the significant swing low, which is the origin of the move in an uptrend. Then drag your cursor and click on the most recent swing high. Finally, drag your cursor back down and click on any of the retracement levels. Now this will automatically display each of the price extension levels, showing both the ratios and their corresponding price levels. And in a downtrend, the general idea is to take profits on a short trade at a Fibonacci extension level, since the market often finds support at these levels. And the concept actually remains the same. You need to select the trend-based Fibonacci extension tool from the left side panel and click on the 3 swing points. So you will have to start with the most significant swing high, which is the origin, and then click on it, drag the cursor down, click on the most recent swing low level, and then again drag the cursor back up and click on the most significant retracement level. Now the software will automatically plot all the price extension levels and their corresponding ratios. And as you can notice, the major extension levels includes 100%, 127.2%, 161.8%, which is actually the golden ratio, and so on. You can always go to the settings and play with it to understand how different levels will look like in the chart, and you can also change the appearance of the levels and so on. Now coming back to our discussion, let's take an example to understand things better. Now this is Nifty 1-day chart. The market is trending up and we have a swing low, a swing high, and a retracement, which is perfect for bringing up our Fibonacci extension tool. Now first, select the swing low, which is the origin of the move, then drag the cursor and click on the swing high, and then drag the cursor back down and click on the lowest point on the retracement. This will automatically bring up all the Fibonacci extension levels, which are none other than possible price levels where the price could face resistance. Or in simple terms, these could be levels where potential selling pressure could come in. This also means that these are good levels for setting up our targets. Now let us see what happened to the price afterwards. In terms of retracement, the price got a good support at 50% retracement level. Then the price started to move higher. The price rallied all the way to 61.8% level, which formed a swing high level. Then it fell back to the 38.2% level, where it found support again. The price rallied again and found some resistance at 100% level. A couple of days later, the price rallied again before finding a short resistance at 161.8% level and moved higher to 200% level, and finally found some good resistance at 261.8% level. As you can see from the example, 61.8% level, 100%, 161.8% and 261.8% levels all would have been good places to take off some profits. Now let's look at an example of a downtrend. Let's take the case of Coforge on our daily time frame. Note that you can use any time frame that you like for analysis and trading using Fibonacci. So if we look at the Coforge retracements, it is clear that we have a shallow retracement between 23.6 and 38.2% level for a while. Now let me bring up the Fibonacci extension tool to mark its potential take profit levels if you intend to short its futures or options. So we'll click on the swing high, which is the origin, then drag the cursor and click on the swing low, and then drag the cursor back up to the highest retracement point, which is between 23.6 and 38.2% level, and click on it. Now all the Fibonacci extension levels are plotted, and let's see how the trade would have performed. Now the price found support at 38.2% level, stayed there for a while, and even made another sharp retracement before falling lower. Then the 50% level held as initial support, then became an area of interest, and as the price moved lower, the 61.8% level also became an area of interest before the price shot down to test the 100% extension level. So if you look at it, you'll find that the 100% extension level also acted as a strong support. So in short, we could have taken profits at 38.2% level, 50%, 61.8% levels, and with some patience, even at 100% levels. All these levels acted as support, possibly because other traders were keeping an eye out for these levels for taking profits as well. Now, these examples illustrates that price finds at least some temporary support or resistance at Fibonacci extension levels, but not always, but often enough to correctly adjust your position to take profits and manage your risk. But of course, there are some problems to deal with here. The first one is that there is no way to know which exact Fibonacci extension level will provide a support or resistance. Secondly, there are occasions where some of these levels may or may not act as support or resistance. The price might neglect it and move past it as if it does not even exist. And the problem is determining which swing low to start from in creating the Fibonacci extension level. This usually happens when the price consolidates in a level so much so that multiple highs or lows are created, which can actually confuse traders. Again, the point is that there is no one right way to do it. But with a lot of practice, you will make better decisions of picking swing points. You will have to use your discretion in using Fibonacci extension tool. You will have to judge how much longer the trend will or may continue. So if I were to talk about the important levels, from my experience, the best levels to set your targets based on Fibonacci extensions are 61.8%, 100%, and 161.8% levels. I'm not saying that other levels are useless or not worth considering, but these three levels gives good results most of the time. You can also use trailing stop losses along with these levels to improve your odds of booking the profit. Trailing stop loss can be as simple as moving averages or an ATR based stop loss like Chandler's stops. I've already made videos on setting stop losses and on ATR indicator. You can watch it to know more. Now, we have come to the final topic of our discussion, which is Fibonacci expansions. Expansions are also used for profit taking or for trend forecasting or simply for getting an idea on how far the trend might move. For this scenario, we will use the exact same tool to plot the expansions that we have used to draw the Fibonacci extension levels. But we will only require 2 points and 3 clicks to draw the expansions instead of 3 points and 3 clicks in case of extension levels. The 2 points required are simply the swing low and swing high of the impulse move. Now, how to draw the expansion levels? Let's take a look at the process for an uptrend. For an uptrend, we require a swing low and a swing high. The swing low is the origin of the swing. So we will select the trend-based Fibonacci tool from the left side panel. Then click on the swing low, then drag the cursor and click on the swing high, and then drag the cursor all the way back down to the swing low or the origin, but make sure to shift this click towards the right for better visibility. Now this will automatically plot all the expansion levels. There is not much of difference in ratios of levels being plotted, but what is more important to understand is that Fibonacci extensions are used to project the potential levels up to which the price could move up after a retracement. But when it comes to Fibonacci expansions, we are literally projecting the entire swing that we have considered. That is, we are projecting 100% of the swing that we have considered over and above the swing highs in case of an uptrend. If you ask me, what is the use of doing so? I would say there is not much of a strong use case here. But one thing that I have noticed is that we can make use of the golden ratio or 161.8% level more by making use of these expansion levels in comparison to the extension levels. Because in extension levels, 161.8% is a very large price target. And it is a common practice to use 61.8 or 100% extension levels for targets, as they are easily achievable most of the time. But with expansion levels, 161.8% is quite easily achievable. Now let's look at an example for a downtrend also. In this case also, we will require the swing high and swing low. The swing high is the origin or the start point of the bearish impulse swing, while the swing low is the end of the impulse swing move. So once the start and end points are identified, select the trend-based Fibonacci tool from the left side toolbar then click on the swing high, then drag the cursor down, click on the swing low, and then drag the cursor all the way up to the swing high and place the cursor in line with the swing high level towards the right and click. The expansion levels will be automatically plotted. Even in this case, levels like 127.2%, 161.8%, 200%, etc. will be our potential take profit levels. You can always go to the indicator settings and add or remove more ratios. You can even change the ratios if you want, even though it is not recommended. Anyways, these are the 3 Fibonacci tools that you must know as a trader. It doesn't matter if you are an intraday trader, swing trader, or positional trader. These Fibonacci tools work in all type of liquid charts and across all different time frames. We can use these levels to make buy or sell decisions or to set stop loss and take profit levels. However, it is important to note that Fibonacci trading is just one of the many technical analysis methods, and it should be used in conjunction with other forms of analysis before making any trading decisions.
I will talk about CPR, which is a revolutionary level-based indicator that can change the way you approach trading and the way you see the charts and improve it big time. We will learn about the CPR and floor pivots in greater detail with more emphasis on CPR indicator in particular so that you can create your edge over other market participants. This video will cover the following topics. We will start our discussion with the basics of CPR indicator, followed by the calculations of CPR and what exactly does this calculation mean to a trader. Then we will move on to the advantages of CPR and then to the uses of CPR. We will also discuss the significance of CPR indicator and we will shortly peek into the disadvantages of CPR. Then we will discuss about the general criteria for using floor pivots. And finally, we will end the video up with 2 CPR strategies that you can apply in the market. So without wasting any time, let's get started. Before starting with CPR, we have to understand how it came into being. For that, we should start our journey from floor pivots. See, floor pivots have been around for a long time and many traders have used these pivot levels to master the market for decades. Larry Williams, the famous stock and commodity trader, repopularized this formula of floor pivots by including it in his book, How I Made $1 Million Last Year Trading Commodities in the year 1979. In the book, he described the pivot price formula, which he used to arrive at the next day's probable price range, that is the high or the low. Nowadays, these pivots can go by many names in the market, including pivot points, floors, or just pivots. But we will call them floor pivots. The reason for this is simple but interesting, because they came popular once traders on the floors of the exchanges began to use them. The pivots served as a simple way for these floor traders to forecast the particular day's potential support and resistance levels, since they didn't have sophisticated computers and softwares on the floors of the exchanges back then. Another reason is that this name helps to distinguish them from other types of pivot points. Now coming back to the details, floor pivots are extremely powerful price-based support and resistance levels that are calculated using a prior period's high, low, and close prices. Actually, it offers an amazing way to view the market. They are like maps for the market, revealing the moves of the market even in the most uncertain times. So when we begin to study the pivots on a much deeper level, you will begin to observe the parallel nature that exists between the floor pivots and the price behavior. Now you may ask me, why in the world should I believe that these levels will work in the market? The main reason these pivots can be so unbelievably accurate is the simple fact that market participants are aware that these levels exist. Now they are watching them and trading these key levels every now and then. It all boils down to the trader psychology and human nature for that matter, which has remained the same for centuries, and the factors that run the market are the same: fear, greed, hope, and uncertainty. These are the reasons why traders continue to react to these key levels in the chart the same way over and over again. This is also the reason why these pivots have stood the test of time and will continue to work in the future. Now let us look at the standard floor pivots and then take our learning to a whole new level with slight modifications to the same. I will guide you through these topics based on my learnings from the very famous book Secret of Pivot Boss by Franklin Ochoa, for whom I am deeply indebted to, and I urge you to read the book because it has got a lot of valuable insights for all types of market participants. As I have mentioned, even though the floor pivots have been around for decades, they can still cause confusion due to the fact that there are several variations of the formula that can be found in the market. However, there is one such formula that is widely considered to be the standard one. So all you have to do is to plug in the high, low and close of a prior day or a week or month depending on the time frame on which you want to conduct your analysis. And the formula will automatically calculate the central pivot, 3 resistance levels from R1 to R3 and 3 support levels from S1 to S3 that can be used for the current day's trading activity. That is, 7 pivot levels will be plotted on your chart. Now, do you know why the high, low and close are used for the equation? It is simply because they are the most important values for any given time period, whether it is a single 5-minute candle or an entire day or an entire month. In fact, the high and the low represent the most bullish and bearish expectations for the market for a given period of time, thus making these values an important reference point for the equation. Likewise, where the price closes gives an insight into the collective behavior of the market while heading into a future period of time. Now take a look at these equations. The pivot is calculated as an average on the 3 significant prices in a prior trading period or a prior trading day. All the other values are calculated from this basic value of the central pivot only. The standard floor pivots provides a lot of vital information about the prices. But in order to make the indicator exponentially more dynamic and responsive, we have to focus on some modifications. First of all, given today's volatile markets, just a third level of support and resistance can be quite shallow due to the explosive moves we see today. As a matter of fact, the volatility was less of a factor in the late 1980s and all, when the formula that Larry Williams produced offered only 2 levels of support and resistances. However, it is not going to gauge the moves that we experience these days. So we can add a 4th level or even a 5th level for that matter of support and resistances to the equation that falls in line with the general theme of original levels. So the addition of this 4th level of support and resistance helps to provide an extra target for those days when the market has exploded through the 3rd layer of the pivot levels. On top of that, taking the concept of pivot range from Mark Fisher's book, The Logical Trader, we can include a top and bottom pivot in relation to the central pivot of the indicator, which by itself is extremely powerful. Now these are the expanded floor pivots, which consist of a total of 11 levels. The central pivot range or CPR is an indicator that is used to identify key price levels to set up trades. CPR is quite beneficial if you are an intraday trader. The CPR consists of 3 components: a central pivot, a bottom central pivot that is below the central pivot, and a top central pivot that is above the central pivot. All these levels are derived out of the underlying high, low and close calculations of the previous day. So the central pivot is the average of the high, low and close, while the bottom central pivot is the average of high and low of the previous day, while the top central pivot is the sum of the pivot and the difference of pivot and the bottom central pivot. If you understand the formula closely, one thing you will instantly notice is that these equations are simple averages and manipulation to these averages. So as a thumb rule, in any technical indicator, the moment you see averages, you need to associate the indicator with an underlying trend. The CPR indicator does just this. That is, it helps the trader identify key price points and the associated trend around these price points. But there is a lot more to CPR which makes it extremely special. We will get back to this in a bit, but let us briefly discuss the advantages of CPR first. The CPR is absolute without a doubt the most powerful part of floor pivots indicator. At any given time, the CPR range can be a support or resistance to the prices. It can also help to forecast with a good degree of accuracy if the next day will be having a trending or sideways price behavior. can also dictate the price direction and also the price momentum. The CPR can tell you so much about the potential movement of the upcoming day and even how the prior day performed. Moreover, CPR is the same in all time frames, or these levels are constant throughout the day. For example, if you have used the previous day data for the calculation of today's CPR, then the CPR will remain the same in the 1 minute chart, 5 minute chart, or 15 minute or even 1 hour charts for that day, and it does not change as constant values are used for calculation. Many people think that the central pivot range is helpful only for intraday trading, but this is not true. There are many traders out there who use CPR for both intraday as well as swing trading. And it is also a very powerful concept that can be very beneficial to every trader if he knows how to use it correctly. So if you are using TradingView, then you can make use of the CPR indicator by Gomati Shankar from the TradingView indicators library. I personally use it myself. Now in the indicator setting, there are a lot of options to select from. But from an intraday perspective, we are only interested in the daily pivots, and maybe you can also use the previous day highs and lows, as these can be potential levels of interest in the market. Don't worry, we will discuss all of this in greater detail as we go through this video. One of the main characteristics of floor pivots and CPR is that these are leading indicators. Traders who use price-based indicator are using the earliest price information available. Traditional indicators are usually lagging indicators, which means that as soon as they confirm a move, most price-based traders have already identified a reversal and are already profiting in their trades. So the truth is that the best leading indicators are always price-based, be it the floor pivots, the Camarilla, the money zone, etc. Anything lagging and you will be trading from the back of the crowd instead of leading from the front. In addition to that, the fact that you can plot the next day's pivot is a breakthrough. Back then, it was a time-consuming task that included putting in values to the equations and plotting the lines in the chart, but now it is extremely easy. All you have to do is to uncheck the daily pivots from the indicator settings after the market closes in the evening, and then enable tomorrow's pivots, and you can straight away view tomorrow's ranges and levels with ease. This will help you analyze where the potential levels are for the next day and plan for different situations beforehand and set a strategy for each of these situations that is possible. The idea can be extended to other timeframes also in case of swing or positional traders by simply enabling the weekly and monthly pivots in contrast to the daily pivots. This idea of forecasting can get even better when we discuss pivot relations. But first, let me talk about pivot width forecasting. Since the prior day's trading activity leads to the creation of today's pivots, it is extremely important to understand how the market behaved on the prior day in order to forecast what may occur in the upcoming session. So more specifically, if the market experienced a wide range of movement in the prior session, as with a trending day, the pivots for the following day will likely be wider than normal, meaning that the distance between the top central pivot and the bottom central pivot will be very high or wide, which will usually lead to a range day or a sideways day where not much price action is expected. Conversely, if the market experiences a very quiet trading day in the prior session, the pivots for the following day are likely to be unusually tight or narrow, meaning that the top and the bottom central pivots will be very close to each other and will be very close to the central pivot also, which will typically lead to a trending day or a double distribution trend day where either a clear trending price action is visible or potential range breakouts and rallies are possible during the session. So it is important to understand the pivot width concept, as this information allows you to prepare properly for the specific day types in the upcoming session. So if you are able to anticipate the market's likely behavior, you are giving yourself the best chance at success because you are able to deploy specific trading setups that are tailored for certain types of days. So anytime you have an idea of how the market will behave in the following session, you are giving yourself a significant edge over the other traders. So as I have mentioned, when describing the width, I am referring to the distance between the top central pivot and the bottom central pivot, that is TC minus BC. Typically, an extremely tight central pivot range indicates that the market traded sideways or consolidated in a prior period of time. As such, this price behavior usually leads to a breakout or trending behavior in the following session, and conversely, an extremely wide central pivot range indicates the market experienced a wide range of movement in the prior day, which usually leads to sideways or trading behavior in the following session, as I mentioned. An important factor to note, however, is that the pivot width analysis works best when the range of the prior price movements is distinctly high or low, thereby creating unusually wide or unusually narrow pivots. What this means is that it must be clear that the width of the pivots is either abnormally wide or extremely narrow, as these are the sessions that grant us a higher probability of forecasting success. If the pivot width is not distinctly wide or narrow, it becomes challenging to predict the potential trading behavior with any degree of certainty for the next session. So you must also keep this in mind that this analysis is not without fault. Measuring pivot width gives you a significant edge in determining the potential behavior for the upcoming session, but unlike any form of technical analysis, this method is not always correct. Therefore, it is best to use it as a guideline. Now let us take a closer look at the pivot width relationship that can lead to one of the most explosive days in the market, the narrow pivot range relationship. So an unusually narrow pivot range is formed when the top, bottom and central pivots overlap each other, and it usually indicates that the market is all set for an explosive breakout opportunity. Therefore, it becomes highly beneficial to know when this relationship has formed. If you have studied the chart patterns and price action, you will understand that the consolidations and trading ranges leads to breakouts and range expansion. Essentially, what a tight pivot range is telling you is that the prior day was consolidating, which usually leads to a breakout on the day with the narrow pivot range given the right opening circumstances. And also, if you observe the charts, most trending days occurs when the central pivot range is considerably tighter than the prior day's range, especially if the prior day's range is unusually wide. So you can make use of screeners to look for narrow CPR in charts and then go on to each chart to analyze them. Do keep in mind that the more narrow the range, the stronger the expected trend or the price move will be. Understanding how the current day CPR relates to the prior day's CPR will help you go a long way towards understanding the current market behavior as well as future price movements. Actually, there are 7 types of pivot range relationships that should be considered when analyzing the current strength and the attempted direction of the market. So these 7 relationships are the higher value relationship, the overlapping higher value relationship, the lower value relationship, overlapping low value relationship, unchanged value, outside value, and inside value relationships. Each pivot range relationship brings with it a directional bias or an expected outcome, which you can prepare for certain types of trading scenarios in the upcoming session. Each of these 7 pivot range relationships depend on 2 important prices: the prior day's closing price and the current day's opening price. Where the market closes in relation to the pivot range gives you an initial directional bias for the following session, which you can actually plan for after the market closes. But it is only the next day's opening price that will either confirm or reject this bias that you had, which then gives you an opportunity to adjust for which type of trade you should be prospecting to. Now let's take a look at the first 2-day relationship, which is the higher value relationship. This relationship occurs when the current day's pivot range is completely higher than the prior day's pivot range. This means that today's bottom central pivot is higher than the top of the prior day's pivot range. This is the most bullish relationship of the 7 2-day combinations. Therefore, when this relationship develops, your initial directional bias will always be bullish. Also, if the price closed above its pivot range in the prior session, then we can expect that the market is positioned to move higher in the upcoming session. However, as I have mentioned earlier, how the market opens the next day will either confirm or reject this initial bias. So if the market opens the day anywhere above the bottom of the pivot range, you will only look for buying opportunities, preferably at a pullback to the range ahead of a move to the new highs. This is especially the case if the price opens above the top of the range. The simple fact that the price opened the day above the bottom of the range indicates that the market sentiment remained bullish overnight. When this occurs, any pullback to the range will likely be met with a responsive buying activity. But if the market had opened the session below the central pivot range, then a completely different outcome would have been the result. That is, the price may face a resistance at the CPR, and as a result, it can push the price lower because a change in the market sentiment has occurred overnight that caused the price to open below the range. The next pivot range relationship is the overlapping higher value relationship, which offers a moderately bullish outlook for the upcoming session. Now, this relationship occurs when today's pivot range is higher than yesterday's range, but it overlaps to some degree. Therefore, the top of the range is higher than the top of yesterday's range, but the bottom of the range is lower than the top of yesterday's range. The same closing and opening price dynamics are in effect for this relationship as well. So, if the market closes above its range in the prior session, a bullish bias should be assigned to the following day. However, where the market opens in the following session will either reject or accept this directional bias that we have had. The next type of pivot range relationship is the lower value relationship, which occurs when the current day's pivot range is completely lower than the prior session's range. This is the most bearish 2-day relationship, and it typically leads to further weakness given the current day's opening price confirms the directional bias that we have. So if the price opens the session below the CPR, we will be looking for shorting opportunities at any pullback to the range ahead of a drop to the new lows within the current trend. When you see a 2-day relationship that is clearly a lower value situation, it points to continued weakness in the upcoming session. As mentioned, the bias is confirmed by the fact that the price closed below the pivot range. Moreover, the price opens the current session below the CPR, which offers the best opportunity to sell a pullback if at all the price tests the pivot range. Even though the lower value relationship is the most bearish 2-day relationship, the opening price plays a very crucial role in confirming our bearish bias. That is, if the price somehow opens above the CPR, it indicates a drastic shift in the market sentiment overnight. And there is a great chance that the pivot range can now act as a support, which can initiate responsive buying to the upside. The next 2-day relationship is the overlapping lower value relationship. This occurs when the current day's pivot range is lower than the prior day's range but overlaps to some degree. That is, the current day's bottom central pivot is lower than the bottom of the prior day's range, but the top of the current day's range is higher than the bottom of the prior day's range. Now, this relationship indicates a moderately bearish outlook for the upcoming session. That is, if the price opens within or below the pivot range, the price is expected to continue lower, and any pullback to the range should be seen as a selling opportunity. And the closing and opening price dynamics are in effect for this relationship as well. That is, if the market closes below the range in the prior session, a bearish bias should be assigned for the following day. However, where the market opens in the following session will either accept or reject our directional bias. Moving forward, the 2-day unchanged value relationship occurs when the current pivot range is virtually unchanged from the prior day's range. Of the 7 2-day relationship, this is the only one that can project 2 very different outcomes on the following day. On one hand, a 2-day unchanged pivot range indicates that the market is satisfied with the continuation of trade within the current or the existing range. When this occurs, the market will trade quietly within the boundaries of the existing 2 or 3-day trading range. On the other hand, however, a 2-day unchanged pivot range relationship can also indicate that the market is on the verge of a major breakout opportunity. Now, the outcome of this situation is typically driven by the opening price of the current session. So, if the market opens the day near the prior session's closing price, but well within the prior day's range, the market will most likely lack the conviction necessary for a breakout attempt. But if the opening occurs beyond the prior day's range or very close to the range, then the chance of a breakout opportunity cannot be denied. The outside value relationship happens when the current day's pivot range completely engulfs the prior day's range. This two-day relationship typically implies sideways or range trading activity, as the market is happy with the current facilitation of the trade in the current price range. The huge width of the pivot range will also lead us to this conclusion as well, since a wide range will usually indicate range trading behavior, where the prices basically trade sideways quietly throughout the day. When this two-day relationship develops, you can look to execute short straddles or short strangles to benefit from the premium decay. An exception is when a clear trading range has been formed, which can offer nice intraday moves within the boundaries of an established range where you can profit from short scalping trades. An important thing to keep in mind is that this relationship is much more revealing if the current day's price range is significantly wider than the prior day's range. Otherwise, just merely engulfing the prior day's range without the necessary width may even lead to the same result but with a very less accuracy. The last two-day pivot relationship is the inside value scenario, which occurs when the current day's pivot range is completely inside the prior day's range. This two-day relationship typically implies a breakout opportunity for the current session, as the market is likely to attempt a breakout. If the market opens the day beyond the prior day's range, there is a very good chance that the initiative participants will enter the market with conviction in order to push the prices to new values, since the market sentiment seems to have clearly changed overnight as indicated by the opening price. This two-day relationship does not occur very frequently, but on days when it develops, this usually leads to major trending sessions. Now, the two-day pivot range relationships offer guidelines for trading virtually any type of market condition, be it trending, breakout, and trading range. But it is up to you to properly interpret the two-day relationship and apply confirmations before entering a trade. This is one of my favorite ways of using pivot ranges in charts. Using the CPR to gauge the market trend is extremely powerful. You may know from the basic price structure that an uptrend is characterized by higher highs and higher lows of the price swings, while a downtrend is associated with lower lows and lower highs of prices. When it comes to the pivot ranges, we can think of ascending pivots in case of an uptrend, where these centrals form a higher value relationship, or an overlapping higher value relation where the prices continue higher. On the flip side, we can think of descending pivots in case of downtrend, where the central ranges form a lower value relation or an overlapping lower value relation and the prices fall lower. As a matter of fact, I can remove the price from the chart, leaving only the central pivot range, and even then you should be able to tell what the market is doing and still make money. You can easily see the trends of the market and make money by only trading the direction of the prevailing trend. As you already know by now, the CPR can be one of the best sources of support and resistance in the market. Due to this fact, they can control the tide of the trend. Another thing to notice is how the price remains above or below the central pivot range throughout a trend until it either stalls or changes direction. So a strong trend can be usually gauged by how the price remains at or above the bottom central pivot in an uptrend and at or below the top central pivot while in a downtrend. Once the price violates this pattern by closing beyond the range for the day, you can observe either a change in the trend or a trading range market develop. Now, this behavior is a blessing for most swing traders, as they could enter the market once the pivot range is violated and then trade in the direction of the newly developed trend while holding their stop losses just beyond the opposite side of the central pivot range. For example, you can catch majority of uptrend using the pivot range by keeping the stop loss below the bottom central pivot. You would remain in the uptrend up until the prices close below the bottom central pivot, at which point you would liquidate your trade. One of the most common signals that you get associated with a change in trend direction is due to a narrow range CPR breakout. So if you know about the different market stages, starting from accumulation followed by markup or uptrend, then by distribution to markdown, and finally accumulation again. And if you don't know about it, you can watch this video on market structure from my free price action trading course. Do check that out after this video. Now, after a period of uptrend, for example, two things can happen. The market will take a breather, thereby forming a range or consolidation for a few days. Now, the problem is that this can either be an accumulation phase or a distribution phase. Now, if this is a reaccumulation phase, then we can expect a continuation of the uptrend. But if this is a distribution stage, then a reversal towards the downside is in play. This is where the narrow CPR comes into picture. So if you observe the charts, most often before a trend continuation or reversal after a consolidation, price forms a narrow range, thereby forming a very narrow CPR, due to which the prices explodes on that particular day, giving an idea about the direction in which the market will move in the upcoming sessions. In simple words, the narrow CPR decides the market trend for a short term. Now, you can use all these observations from the study to improve your analysis for the next day. Nowadays, on most trading days, the market gaps at the open of the session. When this occurs, you have two options. Either to take a potential breakaway move from one of the floor pivots, or you can wait for the market to fill the gap. In either case, a gap at the open indicates that the market sentiment has changed overnight. One important feature of the CPR is that it has an amazing magnetic effect on the price, which leads to a high percentage fill of the morning gaps. So I have mentioned that CPR is an average price-based level. So the central pivot range is the equilibrium of the market for that particular day. So if the price opens the day with a gap and the centrals are very close to the prior day's closing price, you typically see a fill of gap a high percentage of time given the right circumstances. This is like a magnet attracting iron nails. The centrals attract prices, causing the gap to fill. So all we have to look for is responsive market participants to enter the market and push the prices to the central range. Or in other words, we have to look for price rejections of newer values and let the market return to the fair value, which is actually the central range. Now, while this trade looks simple, there are a few additional tips that can help make this trade even more powerful as well as profitable. So for instance, trading the right size gap greatly increases the success rate of these setups. The gaps that are too large don't tend to fill as easily as those that are moderate in size. So it is better to stick to those gaps that have a fighting chance to fill, and the pivot range will do the rest. Secondly, the pivot range placement should be at or very near to the prior day's closing price. So when this is the case, the pivot range helps to attract the price to fill the gap. Also, you must remember that the goal of the trade is to play for a fill of gap back to the CPR, which means the trade will be usually very short. This indirectly means that you don't have to wait all day for a gap to fill, because the longer the trade takes, the more unlikely the gap is to fill. Another important point to note is that the trend can also play an important factor in the successful outcome of a magnet trade. If you recall from the trend identification part, when a market has formed an established trend, the price will usually pull back to the pivot range before resuming in the direction of the trend. Therefore, if the market has formed an uptrend and the price gaps up in the direction of the trend, there is a very good chance that the price will drop to the pivot range before another round of buying pressure is seen, thereby causing to fill the gap. This market behavior lines up perfectly with the idea of magnet trade. Another important factor to consider when trading this setup is looking for additional pivot confirmations that can add to the success of your trade. So if the price gaps up to R1 resistance or gaps down to S1 support, these floor pivots can serve as a barrier to the breakout trade, which usually leads to a high percentage of gaps getting filled. So knowing where the support and resistance levels are can help you give confidence in entering a trade, especially if the market gaps up at the open. On the contrary, any gap beyond these R1 and S1 levels, these levels will resist the price from reverting to the CPR and thereby eliminating a magnet trade. A CPR is called a virgin CPR when all the candles on a particular trading session have closed either upside or downside of the CPR, and none of the candles closed at the CPR, meaning that the CPR range was not tested even once in the entire session. A virgin CPR can act as a strong support or resistance for the subsequent few trading sessions. So whenever you see a virgin CPR on a stock or an instrument, you can extend it or mark it for the upcoming sessions. So when the price comes to that virgin CPR level, you'll probably see a very strong reversal. This is a powerful level to look forward to, as the price will respect this level once it reaches it and will most probably reverse from it. Now, one of the disadvantages of CPR is that you will not get a good result in a penny stock or a small cap stock because of the lack of participation or volume, which makes these levels less useful. So it is best to stick to indices like Nifty and Bank Nifty and those stocks only which has a good enough volumes. This is directly related to the way these levels works, as it is dependent directly upon the psychological value that the market gives to these levels, and the more number of people observing these levels, the better it will work. Another disadvantage is that you will not get an entry or exit solely from CPR. So CPR can act as a support or resistance to prices. So it is difficult to judge the trade direction within the CPR, and it is advisable not to take trades with a directional bias from inside the CPR range. Instead, we will use floor pivots for planning our entries, exits, and stop losses. We will now take a look at some of the general rules that we can follow while using the floor pivots for trading. Buy at support in an uptrend and sell at resistance in a downtrend. This is the most basic way of using floor pivots that can be easily overlooked, but it is one of the most powerful concepts that you can take away from using pivots. Essentially, we will discuss the concept of pivot filtering based on the current trend of the market. In a sense, we can filter out all other floor pivots below S1 while keeping the central pivot range and resistance levels when the market is in an uptrend. In a downtrend, all pivots are filtered above R1 while keeping all support levels and the central pivot range. Basically, filtering the pivots in this manner forces you to become disciplined to the trend, which increases your chances for a profitable outcome. The filtered pivots allow you to focus on playing the pivots that are more prone to reversals with the corresponding trend. That is, if you remove all the pivots below S1 support, you are forced to remain disciplined to a bullish trend by looking for long opportunities at S1 and the central pivot range. Likewise, removing all pivots above R1 forces you to prospect in the direction of a bearish trend, only looking for short opportunities from these levels. This seems like a very simple concept, but many traders can lose focus of the trend through all the noise that comes along with trading. The fact that when the market is moving within an established trend, certain pivot points become retired for that particular trend. It is at this point that your focus should shift to the pivots that are active for key trading opportunities. For example, in a bullish trend, any pivot level below S1 level is literally useless on your chart, since these levels are not tested during a true bullish advance. Likewise, any level above R1 is just noise during a bearish trend, as these levels are rarely tested during a true price decline. Therefore, if the market is trending higher, you will look to buy at the support at either S1 or central pivot range with your target set to R1 or R2 levels. Likewise, if the market is trending lower, you will look to sell at the resistance at either R1 or the central pivot range with your target set to a new low at either S1 or S2. You see, trending markets have a very interesting dynamic when it comes to pivots. As you have already seen, the market will remain strictly above S1 in a bullish trend and below R1 in a bearish trend. However, once a severe breach occurs through the first layer of pivots, you will see a shift of the trend towards the opposite extreme. That is, a bullish trend becomes a bearish trend and a bearish trend becomes a bullish trend. This type of analysis is extremely powerful for all type of traders, including intraday, swing, or position traders. Another thing is when we are trading breakouts using floor pivots. What we are actually looking for is to see a gap occur between the prior day's range and value, preferably just beyond the first layer, be it R1 or S1 of the indicator. In addition to that, the gap should not be overextended beyond the second layer of pivots. That is, your chances for a trend day scenario increases if the gap occurs beyond R1 for a bullish breakout play, or if it forms below S1 for a bearish play. If the price gaps to the second layer, we will consider the trade only if the price tests any of the previous pivot levels that were surpassed via the gap and further move in the direction of trend with clear indications using candlesticks like pin bar setups. And if the price gaps too far beyond these levels, I would rather avoid trading on that day, because usually in such scenarios, market will begin to move sideways. The first strategy that we will discuss is the NR4 NR7 strategy. NR4 stands for narrow range 4 and NR7 stands for narrow range 7. This is a very popular strategy and it is one of those strategies that helps to find the calm so that we can prepare and profit for the impending explosive price movement. We know that the market goes through regular contraction and expansion cycles. In this trade setup, we should patiently wait for the market to enter into the contraction phase, which is associated with a reduction in the range of the candles. Generally, we conduct the analysis based on the daily range of the candles. So the time frame that we use for our analysis will be a daily time frame. Now, the narrow range trading strategy is a breakout based method, which assumes that the price of a security trends up or down after a consolidation in a narrow range. We know from the previous sessions that when the range of the candles becomes lower, the CPR becomes narrower, which in turn confirms that a trend breakout is in picture. So the philosophy behind this pattern is same as Bollinger Band squeeze, which is a volatility contraction followed by a volatility expansion. So if you want, you can watch about this squeeze concept in the Bollinger Bands video. Now let us understand what exactly is NR4 and NR7. Now the following are the steps to identify an NR7 day. First of all, you have to get the high and low data of the last 7 days. Then calculate the range for each day. Now, the range as we know is calculated as the difference between the high and low of the particular day. Now, compare the range of today and the previous 6 days range. If today's range is smallest of all the 7 days that has been considered, then today is an NR7 day, else it's not. Similarly, when it comes to identifying an NR4 day, we have to get the high and low of the last few days. Then we have to calculate the range for every day and compare the range of today and the previous 3 days range. Now, if today's range is the smallest of all the 4 days that have been considered, then it is an NR4 day, else it's not. Now, one thing that we can observe is that as the range gets narrower, so does the CPR levels. So our objective is to look for narrow CPR, which gets formed inside the range of the previous day CPR, thereby forming an inside bar like setup in the candlesticks. I would say an inside value narrow range CPR is very much stronger than just a narrow CPR that is formed at a random location. In some occasions, there will be more than one inside CPR or inside bar candles which gets formed, and this is an indication of a bumper trade because the market has contracted so much in volatility that there will be a very strong price move expected in either direction. Now, the direction of the price move is judged based on the previous day closing price with respect to the CPR, the 2-day CPR relationship, and the overall market trend. The trade idea here is quite straightforward, like the one that we adopt with an inside bar. We will look to buy if the price breaks above the high of the previous candle, and we will place the stop loss below the low of the NR4 or NR7 candle and try to capture the entire trend by trailing your stop loss at 1.5 ATR level below the candle. On the other hand, if the price breaks below the inside bar candle, then we will look for a short trade below the low of the NR4 or NR7 candles, keeping our stop loss above the high of the narrow range candle that we have considered. Here also we will look to ride the entire trend by trailing our stop loss. Even in case of a gap up or gap down opening also, the trade setup will remain the same. As a bonus, in order to identify the stocks with these trade opportunities, you can search for NR4, NR7 range screeners like those available in charting, and after finding such stocks, you can analyze if it fits your requirement, and if it does, then you can keep it in your watch list for tomorrow's trading session. The correlation trade setup is a very interesting trade setup, which is extremely profitable but at the same time rare in occurrence. Now, the idea is to use correlation associated with the index and its stocks. In this case, I will discuss only about Bank Nifty. We know that the Bank Nifty index is the index that tracks the banking sector comprising of 12 banking stocks, of which the first 5 stocks, which includes HDFC Bank, ICICI, Axis, Kotak and SBI, which contributes about 85% of the total weightage, and the top 3 banks contributes 62% of the total weightage in Bank Nifty. Now the trade idea is to use this relation. If at least 2 of these heavyweight banking stocks forms a narrow range for the following session, we can expect a similar price action in Bank Nifty index also. Do keep in mind that we have to look for very narrow ranges in order for a trending day to play out the next day with a good amount of confidence. So if 2 or 3 of these stocks and the index forms a narrow range CPR, and in addition if there is also an inside value relation, then we can expect breakouts in all these scripts. And as a result, the index will move with a lot of momentum in either direction depending upon the stocks. In such a situation, you can take a trade in any or all of these scripts, or you can just focus on the index as it will move with a consolidated strength and gain a good amount of profits. Now, it is up to you to properly interpret the CPR and floor pivots and apply proper conformations before entering a trade. The faster you recognize the pattern of the market, the faster you will be able to deploy your strategy, because anybody can plot the floor pivots and CPR on their screen. But only those traders who have a keen understanding of the market's behavioral tendencies with respect to the pivots will profit by using these amazing levels.
I will talk about the RSI indicator, which is one of the most popular trading indicators out there. We will take a look at the RSI indicator in greater detail and fine-tune your view on how to use the indicator to improve your trading results. We will talk about what is RSI and what are the basic things that you need to know about RSI. Then we will move on to discussing the calculation behind RSI and what does it mean to a trader. Further, we will discuss about the significance of RSI or what makes RSI a better indicator. We will also talk about the limitations of RSI or the mistakes that traders makes while using the RSI indicator. We will also take a look at the Andrew Carwell's RSI model and how to modify for a better RSI setting. After that, we will talk about the different uses of RSI indicator. And finally, we will wind the video with 3 RSI trading strategies that you can use in the market. So without wasting any time, let's get started. RSI stands for Relative Strength Index, and it is a momentum indicator that is developed by J. Wallace Wilder. In short, RSI is an oscillating type indicator that moves to and fro between a fixed set of values or ranges. So the value of the RSI indicator oscillates between 0 and 100. What this means is that you can never go below 0 and you can never go above 100. Since the RSI is a momentum indicator, it measures how fast the price moves. The quicker the price has increased, the greater will be the RSI values. Similarly, the faster the price has dropped, the lower the RSI value. And so if the price moves up or down very slowly, the RSI indicator will be in the middle, that is around the 50 or 60 range. The RSI can fluctuate between 20 and 30 and can go all the way up to 70, 80 or even 90, especially when there is a strong momentum in the market. From a conventional standpoint, as described by Mr. Wallace Wilder, what's significant are the levels between 30 and 70. Because traditionally, when RSI reaches 30, it is considered to be oversold, meaning that the selling has pushed the price far too down and the supply is almost depleted. And so, the market is expected to bounce back up or turn bullish. Similarly, when the RSI indicator crosses above 70, the market is considered to be overbought, meaning that buying has pushed the price too far up and there is not enough demand in the market, implying that a price fall is about to occur. So we will talk about this concept later in the video. Let us briefly look at the calculation behind RSI, which will help us understand more about the indicator. Now here's the formula of RSI. RSI is equal to 100 minus 100 divided by 1 plus RS, where RS is the relative strength, which is given by average gain divided by average loss. Okay, don't think that this is too complicated or don't let the math scare you, because this isn't as hard as it looks. Let me break this down so that you can understand it very easily.
So as you can see in the calculation, the only tricky part is the relative strength calculation, which is defined as the average gain divided by average loss. So in simple words, the relative strength or the RS value goes up when the average gain is large or when the average loss is small. Now you might be wondering, how does the value of average gain goes up? So it's very easy. For instance, when the price moves up quickly with little or no pullbacks, your average gain is large because the price is making positive gains, which in turn leads to a higher RS value. Likewise, when the price falls very quickly with little or no pullbacks, your average loss is large in case if you are having a long position, because the price is making negative gains, which in turn leads to a lower RS value. Now with this in mind, because the RS is at the denominator, the larger the RS value, the higher will be the RSI value. And if the RS value is lower, then the RSI value will also be lower. So the key thing to note is that the higher your average gain, the higher your RSI is going to be. I hope it makes sense. Even if not, we will consider some examples. Let's take the case where the average gain is equal to 10 rupees and the average loss associated is 1 rupee. Taking 10 divided by 1, your relative strength or the RS value equals to 10. Now all you have to do is to put this value into the formula and you will get an RSI of about 91. So an RSI value of 91 shows you that there is a strong momentum in the market because your average gain is much higher than your average loss. Let's consider another situation where the average gain is 10 rupees but the average loss is 20 rupees. When 10 is divided by 20, your RS equals to 0.5. Now all you have to do is to put in the numbers and you will get an RSI of 33.34. The reason for this is that your average loss is greater than your average gain. So there is more bearish momentum in the market and that is why your RSI value has fallen. The standard period used for the calculation of RSI is 14, which means that the average gains and losses of the previous 14 candles are used to compute the RSI data. In addition, by default, the closing prices of 14 candles are taken for estimation. What this conveys is that the average gain or average loss can be manipulated by RSI settings. For example, if you choose a 14 period RSI, then the average gain and the average loss will be based on the last 14 candles. Similarly, if you use a 5 period RSI, then the average gain and average loss will be based on the last 5 candles. So if you have used a lower period RSI setting, then the indicator will be more sensitive to recent price movements, and it is the opposite for a higher period RSI setting where the indicator becomes less sensitive to random price movements. As per Mr. Wallace Wilder, the best setting for RSI is the default setting of 14 period itself, but it is not a crime if you want to change the settings for your convenience. One of the main advantages of RSI is that it is a leading indicator. RSI is very often used to obtain early signs of possible trend changes in the market. This feature itself makes it a very powerful tool for intraday traders to get ready for a big price move before it happens and thereby improving their chances of getting a higher return due to an early entry, which is otherwise not possible by a lagging indicator. Another significance of RSI is that RSI can be used with multiple time frames, be it weeks or even months as inputs instead of days, hours or minutes. So by using a longer time scale, it is possible to align your short-term trades with longer term trends. What this means is that if the monthly RSI is reasonably low but is rising, then a buy signal on RSI is more likely to succeed. Similarly, a high but declining monthly RSI suggests that a buy signal in a daily RSI is possibly a false positive. You can gain such insights when you conduct your analysis with RSI on multiple time frames. And finally, being a momentum indicator gives RSI the superpower to identify when the momentum is gaining and when there is a loss in momentum. We will talk more about this while we discuss the uses of RSI later on. If the 14 period RSI is below the 30 levels, what it's telling you is that over the last 14 days or the 14 candles, the prices have dropped a lot in the market and there is a strong bearish momentum and the market is oversold. In that sense, the market has declined strongly, but it does not in any way mean that the market will make a rebound anytime soon. Or just because it's oversold doesn't mean the market will go up higher. This is a mistake many traders make. They think that just because the RSI indicator is oversold, it means it's time to buy. Or just because the RSI indicator is overbought, it's time to short. In reality, what the indicator is telling you is that there is strong momentum in the market. If it's overbought, it's telling you that there is strong bullish momentum. And if it's oversold, it's telling you that there is strong bearish momentum. That's the critical thing to understand and not the other way around. So don't make the mistake of buying just because the RSI is oversold, because what's oversold for you can be even more oversold. So if you look at the charts more closely, you will notice that the real momentum usually comes after the price has moved above the 70 levels, generating an even stronger upside move, or when it moves below the 30 oversold levels, generating a very strong bearish price move. So do keep this in mind. Another issue with RSI is that it can generate a lot of misleading signals if the price is staying within a range. So it is better to avoid trusting RSI signals when the price is consolidating or range bound. The first lesson taught to traders when doing analysis with RSI is how to trade with the overbought and oversold levels. New traders are taught that when the RSI reaches 70 or higher, it is an opportunity to exit out of the long positions or start to consider taking a short position. On a similar note, if the RSI drops below 30 or lower, then it is an opportunity to cover your short position and open a long position. Now it's important to understand that the RSI was designed at a time when the markets were very much range bound. This chart shows the S&P 500 from 1975 to 1980, and you can clearly see that the markets are range bound mostly during the time. So from this perspective of extensive ranges that occurred, the RSI looks like a very powerful tool, and the suggestion to buy an oversold RSI and sell an overbought RSI seems like a reliable and profitable strategy back then. But a lot has changed in the 21st century with the computers, internet, algos and whatnot. And the markets are not always ranging anymore. So RSI needs modifications of its own. For this purpose, you can either follow Andrew Cardwell or Constance Brown. For the time being, I will follow Andrew Cardwell's RSI model. According to Andrew Cardwell, there are 5 types of RSI range shifts that helps to determine the trend of the underlying security. The first one is a bullish range. It is observed that in a bullish range, the RSI tends to oscillate in the 40 to 80 levels. So with this idea in mind, when the RSI reaches 40, it is an oversold zone, and whenever RSI reaches 80, it is an overbought zone. The second range is the super bullish range. So in a super bullish range, however, RSI tends to oscillate between the 60 to 80 range. So whenever the RSI reaches or moves above the 60 to 65 levels, it is a very good opportunity to buy, and it's very likely that the market may bounce back from this level, thereby forming a strong support level for higher price movements. The third one is a bearish range. It is observed that in a bearish range, RSI tends to oscillate between the 20 to 65 zones. Accordingly, when RSI reaches the 60-65 zone, it is now an overbought area, or in other words, it acts as a good selling point on RSI. When RSI reaches up to 20 level, it is now considered as an oversold zone. The fourth range is the super bearish range. Now, the RSI tends to oscillate between 20 to 40 in the super bearish range. So whenever RSI reaches the 40 level, it is a very good selling opportunity for keeping 20 RSI levels as target, because the 40 levels will now act as a resistance level for price movements. Final range is the sideways range. So in a sideways range, it has been observed that RSI tends to oscillate between the 40 to 60-65 zones, which basically helps us to determine that the security or the market is sideways or range bound. So in these range shift scenarios, we have taken an additional range of 5 points, that is 60 to 65, because some stocks works well with the 65 as resistance, while others work with 60 as resistance. Hence, 5-point tolerance in RSI is taken both for higher and lower sides. So this logic of RSI range shift goes well with all types of chart, whether it's index, stocks, commodities, currencies, etc. It is applicable to all these types of charts. Now we will apply this range shift phenomenon in charts and see its utility. Now look at this chart where we will understand the bullish range, super bullish range and sideways range. Now the bullish range is defined with the help of a blue box where the RSI tends to oscillate between 40 to 80 range, where 80 is the overbought condition and 40 is the oversold condition. Now as seen in the chart, whenever RSI touches the 80 zone, the price tends to slow its momentum and turns down. The next green box in the chart indicates a super bullish range under which the RSI tends to oscillate between the range of 60 to 80. Now it is very clearly evident that the stock has given a strong up move during this stage. And finally, the sideways market is shown with the help of a red box where the RSI tends to oscillate between the 40 to 60-65 zones. Here the stock is expected to move sideways or stay within a range. And as a trader, you can witness a lot of whipsaws in the RSI. Moving forward, this chart indicates a bearish range which is highlighted with the help of a violet box. Here, the relative strength index tend to oscillate between 60 to 65 to 20 levels, where 60 to 65 acts as a overbought condition and 20 is the oversold condition. And finally, the chart indicates a super bearish range as highlighted in red, where the RSI tends to oscillate between 40 to 20 range, and it is an indication that a strong down move is very likely. I hope the RSI range shift concept is now clear. What you can do with the RSI indicator is to use it as a trend filter to trade in the direction of a particular trend. In order to do this, you need to play with the RSI settings a little bit. For a start, what you can do is change your RSI settings to 200 period. This settings means that RSI indicator will look through the last 200 candles closing prices to measure the average gains to average loss. Now to make a proper logic out of this, we can use the RSI midline, which is indicated by 50. What the midline represents is that if the RSI is above 50, it means that the average gain is greater than the average loss over a period of time. And if the RSI is below 50, it means that the average gain is lesser than the average loss over a given period. So, if over the last 200 candles, the average gain is more than the average loss, you can imagine that the RSI indicator will be above 50 because there are more gains than losses. Likewise, if over the last 200 candles, the average loss is greater than the average gain, then the RSI indicator will be below 50. So, the RSI indicator can be used to gauge the long-term trend. Now, the essence of this is that if the 200 period RSI indicator is above 50, you can conclude that the market is in a long-term trend and look for buying opportunities only. And if the 200 period RSI indicator is below 50, you can conclude that the market is in a long-term downtrend and you can only look for selling opportunities. Now, when I use the word long-term, it is relative to the time frame you are looking at. Because if you refer to 200 candles on a 5-minute time frame, it will be a long-term uptrend or downtrend on the 5-minute time frame only. So if you do this on a daily time frame, it will be a long-term downtrend or uptrend on a daily time frame. Now the issue with this approach is the sensitivity. As the calculation will include a large number of candles, the signal will be received much later after the price move has already started. So the higher the time frame used, the greater will be the lag. Now with that being said, this is only an alternate method to finding market trends. And if you are not comfortable with this, please avoid using it. And instead, follow the trend identification method using the range shift concept, which is more detailed in the way it expresses the market trends into different zones. But the idea here is to make you aware of different approaches you can take with the RSI. The divergence are a very common application of RSI. For those unfamiliar with divergences, they are a powerful tool that can help identify the dishonesty with the price action. So it mainly develops when the indicator is moving in the opposite direction of the price. The divergences are mainly classified into negative and positive divergences based upon the movement of prices and indicator. So a positive divergence takes place when the prices makes a new low, whereas the indicator makes a new high. Similarly, a negative divergence takes place when the prices makes a new high, but the indicator in turn makes a new low. Now there are different types of divergence patterns. Number one are the regular or normal divergences, which includes a bullish regular divergence and a bearish regular divergence. Similarly, there are irregular or hidden divergences, which also includes bullish and bearish hidden divergences. A regular divergence occurs when the momentum does not support a price trend. We can identify bearish divergences by comparing highs on the price chart against the highs on the RSI. So if the price creates a new higher swing high, but the RSI is creating a new lower swing high, then it is known as a regular bearish divergence. What this tells you is that the prices towards the upside is weakening and there might be a correction in prices soon. So it may not always be a trend reversal, but most probably you can expect a pullback or a minor reversal. Another point to note is that the divergence signal is stronger if the first high on the RSI was formed on an overbought region and the second swing gets formed just below the overbought region depending upon your RSI range settings. On the contrary, if we observe the price making new lower swing lows, but the RSI is forming new higher swing highs, then we see a regular bullish divergence. What this tells you is that the bears are weakening or the bulls might be gaining traction to take the market upside. And there might be chances for a price correction soon. And as stated earlier, it may not always be a trend reversal, but probably you can expect a pullback or minor reversal towards the upside. Another important point to note is that divergence signal is stronger if the first low on the RSI was formed at the oversold region and the second swing gets formed above the oversold region depending upon your RSI range settings. Let us talk about hidden divergence now. A hidden divergence occurs when the trend holds up despite the momentum going against it. So in case of hidden divergence, it doesn't mean something is hiding. Instead, it is hiding the fact that the trend is going to continue. So talking about a hidden bearish divergence, this idea should only be used or considered if it is a part of the dominant trend, meaning that the existing trend in the market should be bearish. So a hidden divergence happens when the price creates lower highs, but the RSI creates higher highs. Now when it comes to a bullish divergence, hidden bullish divergence is only relevant if the dominant trend is an uptrend. So to identify hidden bullish divergence, we need to see the prices creating higher lows while the RSI creates new lower lows. Now what this tells you is that despite the bearish momentum implied by the RSI, the uptrend price structure held up. Hence, the hidden divergence represents a window of opportunity for joining the bull trend at a bargain or discount valuation. So I would say divergence is a great tool to carry out swing trades effectively if you can read the charts properly. But I won't be talking about any strategies associated with divergences because it's already very common and there are a lot of videos available. So I recommend you to learn more about RSI divergences strategies utilizing candlesticks for entries. And finally, we will talk about 3 RSI strategies. The first strategy is the range shift and inflection point on multiple time frames. The second strategy is RSI with 2 EMAs. And the last strategy is RSI trendline break. As we have understood from the Cardwell model, there is a different range of RSI indicator in a bullish market and in a bearish market. So instead of the 70-30 relative strength index, we will use the 60-40 range for RSI indicator for this particular strategy. The range between 40 to 80 of the RSI indicator is used to indicate a bullish market and a range between 65 to 20 for a bearish market. What this tells you is that whenever the market is bearish, it won't be able to cross the 60 to 65 levels towards the upside, meaning that it will act as a resistance level. And whenever in a bullish range, it won't be able to cross below the 40 levels, meaning that the 40 level will act as a strong support level. Now, this range shift concept can be applied in any time frame, whether intraday, daily, weekly, etc., as I have mentioned earlier. The idea is that when the monthly and weekly RSI is above 60 levels, thereby clearly indicating a bullish trend, but when the RSI indicator takes a support at 40 levels in the daily chart, this is the inflection point, which is a good setup because the price may bounce back and most probably it will not go below 40 level because 40 level will act as a support. So when a bullish candle is formed at the 40 level, the prices may bounce back up and you can buy the stock. Now the stop loss in this case can be very aggressively placed at the low of the bullish candle where the movement began. And the first target in this case can be the 60 RSI level. Now on the contrary, when the monthly and weekly RSI is below 40 levels, which clearly indicates a bearish trend in the market, but the RSI indicator takes a support on the 60 levels in the daily chart, forming an inflection point, indicating that the price may fall back and it will not go above the 60 levels, as the 60 to 65 level will act as a strong resistance level. So if a bearish candle is formed at the 60 to 65 RSI level, the price may fall back from there and you can look to enter the stock for shorting opportunities. Similar to the previous case, the stop loss can be aggressively placed at the high of the bearish candlestick where the fall began, and the first target can be the 40 RSI levels. So in short, the idea is to find the overall market trend over two larger time frames. If these two larger period RSIs signal a particular trend and the RSI on the lower time frame is forming an inflection point, then it is a good indication of a trade opportunity. You can change the time frames accordingly to your trading requirement, meaning that if you want to use it for intraday purposes, keep the higher time frames as 1 hour and 15 minutes RSI, and the lower time frame can be the 5 minute to check for the inflection point and also to further take an entry from. We can add an extra piece of analysis to help the RSI as a trade entry tool, and that is with the use of moving averages. Not just one, but two moving averages. The moving averages are not plotted on the price chart, but it is directly added on the RSI indicator. Don't worry if you don't have a paid version of TradingView. You can use this community script named RSI with moving averages by Umar Oskuru. Now you may have this doubt, how can two moving averages, itself being a lagging indicator, help us make trading decisions? But first of all, we have to adjust the settings of our moving average. The black colored moving average is the slow moving average having a 33 period, and the orange colored moving average represents the faster moving average, which is 13 period moving average plotted over the 14 period RSI. Now the basic idea of using two moving averages is to look for crossovers between the slow and fast moving averages. So you can be flexible if you want and make use of different settings like 20 and 9 moving averages also, just to adjust the sensitivity of the indications. Also, it doesn't really matter if you use SMA or EMA, but in this indicator, the fast one, that is the 13 period one, is the simple moving average, while the slower one, that is the 33 period one, is the exponential moving average. The trade idea is quite simple. Look to see when the RSI is pushing above both the moving averages from below. It is better if this crossover of RSI happens below the 50 level. Now you have to stay alert and observe if the moving averages are coming closer together, and if the faster moving average crosses above the slow 33 period moving average, then you can look to take long trades. But keep in mind that you will also have to look at the slope of the moving averages in order to gauge if the move is going to be a significant one. Additionally, you can plan your entries based on the price action formed for better confirmation. Similar is the setup in the sell side. Here you have to observe when the RSI is pushing below both the moving averages from above. It is better if the cross under happens above the 50 level or the midline. Now you have to stay attentive and observe if the moving averages are coming closer together, and if the faster moving average crosses below the slow 33 period moving average from above, then you can look to take short trades. So as mentioned earlier, you have to look for the slope of the moving averages in order to gauge if the move is going to be a significant one or not. Also make sure to use additional confirmation using price action or bearish candlesticks. You can use this strategy effectively for intraday and short-term trades. It is an interesting observation to note that the RSI indicator and the price chart almost go hand in hand. Similar to how we apply trend lines on the price chart, in the same manner we can plot a trend line on RSI. Since the RSI is a momentum oscillator, a trend line will help you determine the momentum direction. All you have to do is to connect the tops and bottoms of the RSI chart itself and trade a trend line break. So in order to draw an RSI uptrend line, you have to connect 3 or more points, generally the higher swing lows on the RSI line as it rises. Similarly, a downtrend line is drawn by connecting 3 or more points, generally the lower swing highs on the RSI line as it falls. Note that drawing a trend line is somewhat subjective. A guideline that you can use is connecting 3 or more points first and then extending the line to see other supports and resistance levels. Now, when the trend line is broken, it shows you that the momentum has reverted or shifted. For example, in case of an uptrend RSI line, which connects 3 or more swing lows of the indicator, which acts as a support level. Now, when the trend line is broken, there is a greater chance that the line will now act as a resistance to the further price swings in RSI. Most probably, the pullback or the rally back to the RSI trend line will reject the swing and the RSI will move down, indicating a downside momentum. In this case, you can enter a short trade when the price breaks below the RSI trend line, or else you can wait for the price to pull back to the trend line once again and enter at the rejection from the trend line. The strategy is similar in case of a downtrend RSI line. You just have to change the rules of the entry criteria to fit a long trade setup. Make sure you use candlesticks and price action to provide additional confirmations. Now bear in mind that the break of RSI trend line usually precedes the break of a trend line on the price chart itself, thereby providing an advance signal or an advance warning and an early opportunity to trade. Which means that RSI trend line break gives an advance signal that the price is going to break the same trend line very soon. Now, you should understand that RSI is not a perfect indicator, nor it is the holy grail to trading. This is why many traders and investors choose to incorporate RSI into their wider trading strategy, which includes price action and additional and popular indicators such as MACD, etc.
I'll be talking about the stochastic indicator, which is among the list of most popular technical indicators in the market. The stochastic indicator is a great momentum as well as a trend following indicator, meaning that it can help traders in understanding trend dynamics and also improve their chart reading or analysis. But all these properties are a waste if you don't really understand the indicator that you're using. Or even worse, if you use these indicators in the wrong way, you end up making bad trading decisions that could have been easily avoided. So in this video, I will help you understand the stochastic indicator in the right way, and I will show you what it does and how you can use it in your trading. And as always, I will start from the very basics of stochastics, followed by the calculation of stochastic, the general settings of a stochastic indicator, followed by the relationships between stochastic oscillator and relative strength index or RSI. And we will also talk about the limitations of stochastic or even the mistakes that traders make while using this indicator. Then we will talk about the stochastic RSI and its advantages and disadvantages over stochastic indicator. And further, we will learn a few uses of stochastic oscillator, followed by different stochastic trading strategies. And finally, we will wind up the video by discussing a few ways in which we can combine stochastics with other tools or indicators. So make sure you watch the video till the end. Dr. George C. Lane was the one who developed the stochastic oscillator in 1950s, way before indicators like RSI, which came into being only after 1978. Unlike other traditional technical indicators that either follow the price or the volume, the stochastic indicator follows the momentum of price of an asset or instrument. This means the indicator measures the oscillations in the price of an asset, which is the reason why it is referred to as the stochastic oscillator. But before we get into using the stochastic, we should be clear about what momentum actually is. In simple terms, momentum is defined as the rate of acceleration of the price of a security or a stock. So in an interview with Mr. Lane, he mentioned that the stochastic oscillator does not follow the price. It does not follow the volume or anything like that. But instead, it follows the speed or the momentum of the price. The way he provides an analogy to understand the oscillator is quite convincing. He asks us to visualize a rocket going up in the air. But before it can turn down, it must first slow down. In a similar manner, momentum always changes direction before price. Or in simple layman terms,
The stochastic is an indicator that measures momentum in the market. But how does the stochastic oscillator actually work? Well, as a matter of fact, the stochastic oscillator compares a specific closing price of an asset with a wide range of high and low prices over a given period of time. As a general rule of thumb, the stochastic oscillator is calculated by taking a 14 period as the standard for calculation. However, as with any other indicator, this period can be changed and adjusted according to your specific needs. Also keep in mind that since stochastic is an oscillator just like RSI, the value of stochastic indicator for any specific time period always stays between a minimum value of 0 to a maximum value of 100. By the way, I have already made a detailed video on RSI indicator, so if you want to know more, you can watch that video. Now the oscillator works on the following theory. That is, during an uptrend, prices will remain equal to or above the previous closing price, and during a downtrend, prices will likely remain equal to or below the previous closing price. This is the basic idea upon which the indicator functions. But in order to understand how and why it works, we will need to dig into the calculations of this indicator. Don't worry, thinking that the calculations are going to be hard to understand. I will try my level best to explain it as simply as possible. Now, as mentioned just now, the default setting for stochastic oscillator is 14 periods, which can be days, weeks, months, or any intraday time frame. There are two variables that control the sensitivity of this indicator. They are %K and %D. Now, what do these variables imply? A default 14 period %K would use the most recent close price along with the highest high over the last 14 periods under consideration and the lowest low over the last 14 periods under consideration. On the other hand, %D is a 3-period simple moving average of %K variable. This %D line is plotted alongside the %K line to act as a signal or trigger line. This looks very similar to the MACD indicator, where there is a MACD line and a signal line, and the signal line is a 9-period exponential moving average of the MACD line. So you can watch a detailed video on MACD indicator from the I button. So what the stochastic indicator does is that it takes the highest high and the lowest low of the last 14 candles, and then it compares it to the current closing price. It is as simple as that. We will see this with the help of two examples very soon. But before that, the indicator uses two simple mathematical formulas to calculate the %K and %D values. The K line formula is given by %K is equal to Cp minus L14 multiplied by 100, the whole divided by H14 minus L14. This is not as hard as it seems. Here Cp is the most recent closing price. L14 is the lowest trading price of the asset in the previous 14 periods or candles. H14 is the highest trading price of the asset in the previous 14 periods or candles. %D is the 3-period simple moving average of the %K line. The %K line is the slow moving indicator and %D is the fast moving indicator, which is measured by a 3-period moving average of %K. Once again, these two lines are similar to the MACD line in the sense that one is faster than the other. As a general rule of thumb, the stochastic oscillator suggests that when the market is moving upward, the asset price will close near the highs, and so will the stochastic values. Similarly, the stochastic oscillator value will close near the low when the market is trending downward and as the asset price closes near the lows. This means the indicator can have different sets of values under different market conditions. Let us understand this in greater detail using some examples. The first example is when we have a high stochastic number. So when your stochastic oscillator is at a high value, it means that the price closed near the top of the range over a certain period of time or a certain number of candles. Now take a look at this chart and consider the 14 most recent candles. Then mark the lowest low, the highest high, and the most recent close price of these last 14 candlesticks. And as you can see, the high is at 110.61 rupees, the lowest low is at 108.76 rupees, and the most recent close is at 110.21 rupees. Now, all we need to do is to equate these values onto the equations. So we can calculate the range between the high and low price, which comes out to be 1.855, which is simply obtained by subtracting the high price and the low price values. And we can also calculate the difference between the highest high and the recent close, which comes out to be 0.399. Now, all we need to do is to divide 0.399 by 1.855 to check how close the price is to the absolute high of the range. Now, the calculation gives us 0.215 or 21.5% when multiplied by 100. This means that the current close is 21.5% away from the top, or in other words, it is 79.5% above from the bottom. And indeed, the stochastic in this example is at 79.5. So therefore, the stochastic indicator tells us how far the price has closed with respect to the highest high or the lowest low of a given price range. And as you have seen, the calculation is quite simple. All you need to do is to just check the total distance of the range between the highest high and the lowest low and see how close the price is closing to the highest high or the lowest low. Moving on to example number 2, that is when we have a low stochastic number. A low stochastic value indicates that the momentum to the downside is strong. In this chart, we can already see that the price has moved significantly lower over the last 14 candles. And we can also see that the current close is relatively close to the absolute low. Only a small candlestick wick is sticking out lower. Just by understanding that, we can already assume that the stochastic indicator has to be very low, since the stochastic measures how close the price is closing to the lowest low and how far away from the price is the highest high. And indeed, the stochastic indicator shows a value of 13.5%. This means that the price is just 13.5% away from the lowest low and is 86.5% away from the highest high. I hope things make sense. Now, similar to how we use RSI, this indicator can also be used to identify overbought and oversold trading signals for any asset. Thereby, it lets you spot price reversals in the market. For instance, if the value of stochastic indicator for a stock is more than 80, then the asset price is considered to be in the overbought region. And if this value is less than 20, then the asset is said to be in the oversold territory. But as with the case of RSI, this indication of overbought and oversold territories should merely be taken as clues of future price movements and not as a conclusive evidence of the price reversal. Now, before moving ahead, let me mention the 3 types of stochastic indicators that you will be able to find. Now, there are 3 versions of stochastic oscillator, and these are fast, slow, or full oscillators. Now, the fast stochastic oscillator is based on Mr. George Lane's original formula for %K and %D that we have already discussed. Now, this is the most common and most used stochastic indicator. But the problem is that in this fast version of the oscillator, the %K line can appear rather choppy. And %D, as mentioned, is the 3-period simple moving average of %K. As a matter of fact, Mr. George Lane used %D to generate buy or sell signals based on bullish or bearish divergences. And Mr. Lane even points out that a %D divergence is the only signal which will cause you to buy or sell. Don't be afraid, we will talk about divergences later on in this video. Now, because %D in the fast stochastic oscillator is used for signals, the slow stochastic oscillator was introduced to emphasize its importance. So, the slow stochastic oscillator smooths %K with a 3-period simple moving average, which is exactly what %D is in the fast stochastic oscillator. So, %K in slow stochastics is actually %D in fast stochastic oscillator. While %D in slow stochastics is the 3-period simple moving average of the slow %K line. This means that the slow stochastic indicator is more smooth or less choppier when compared to the fast stochastic oscillator. Now, you can note down the difference in formulas if you want. Now, a full stochastic oscillator is a fully customizable version of the slow stochastic oscillator. Now, this indicator in TradingView is actually a full stochastic oscillator, but since the variable was fixed to 1433, it is a slow stochastic oscillator. But you can set the look back period, the number of periods for slow percentage K and the number of periods for the percentage D moving average as you wish. But it is not generally recommended to change these values as the default values works well most of the time. Now that we have understood in depth how the indicator is formed and based on what principle it works, we now need to know what type of indicator it is. Is it a leading indicator or a lagging indicator? Now, most of the time we compare stochastics with RSI, but as we already know, RSI is a leading indicator which provides signals prior to the actual price move. But unfortunately, stochastics is considered a lagging indicator. So, a lagging indicator like stochastics follow price action and give signals after the price has already moved, as opposed to leading indicators that are designed to anticipate future price movements. And you may ask why stochastics is lagging? Now the reason being a stochastic indicator is based on historical data and is calculated using the closing prices of an asset over the recent 14 period. Now it compares the current closing price to the high and low range of the prices over this 14 period, which helps identify whether the asset is overbought or oversold. Now, because stochastic indicator is based on historical data, it is slow to react to the market conditions and can be slower to identify the turning points in the market. Now, this is why it is considered as a lagging indicator, and this means that the signals generated by the indicator can be delayed and may not always be accurate. But as always, it is important to keep in mind that even lagging indicators can be useful for confirming signals which are generated by leading indicators, and it is also useful for identifying trends. But as a matter of fact, it should not be used as a standalone indicator. We need confluences or we need more confirmations. We compare RSI and stochastics more often because of the fact that both these looks and function similarly even though the calculations are entirely different. So let's see if there is any relationship between the stochastic oscillator and the relative strength index or RSI. The first similarity is that both of these tools are price momentum oscillators that are widely used by traders. I have seen a lot of traders, for the sake of increasing the accuracy of a buy or sell signal, they often use the stochastic oscillator and the RSI in tandem. You can argue that the objective of both these technical indicators may be similar, which is measuring momentum in the price move, but as stated just now, the underlying theories are different. See, the stochastic oscillator works on the theory that the price of an asset tends to close near its high during market uptrends and close near its low during market downtrends. RSI, on the other hand, works by measuring the velocity at which the price of an asset moves. So this helps us realize the fact that when we are faced with a market that moves in trends, that is either uptrend or downtrend, then RSI can be a very useful indicator for identifying overbought and oversold conditions. However, when the market moves sideways or in a choppy price action, then the stochastic indicator is of more use. For some of you, it may not be clear, so let me explain in detail. Consider a trending market. So in a trending market, the asset price tends to move in one direction, making it more difficult to identify the overbought and oversold conditions. So in a strong uptrend, for example, the asset price may remain overbought for an extended period of time, making it difficult to determine when to sell. Similar is the case when a strong downtrend is in play. But when dealing with a sideways market, the asset price tends to move within a range, with a clear resistance level at the top and a support level at the bottom. And when the asset's price approaches the resistance level, it is more likely to become overbought. And when it approaches the support level, it is more likely to become oversold. So in this type of markets, RSI may provide very less useful information as it may give false signals due to the lack of trend momentum. But fortunately, stochastics is considered to be better used in sideways market because it is designed to identify these overbought and oversold conditions, which are more likely to occur when the price asset is trading in a range rather than trending up or down. But a point worth noting is that stochastics still can be used in trending markets, and you can use it in conjunction with other indicators and analysis such as moving averages, trend lines, support resistance levels, etc. Now let's move on to the application side of this indicator. Let us discuss the main uses of stochastics. I will be explaining 3 main uses of this indicator. There may be other uses, but the ones that I will be talking about are the most popular ones. These include identifying oversold and overbought levels, bullish and bearish divergences, and finally bullish and bearish setups. So let's start off with the first use. As we have discussed, the stochastic indicator is designed to identify overbought and oversold conditions in the asset price. Now, if you don't know what these are, let me clear it up to you. An overbought condition occurs when the closing price of an asset has been consistently high over a recent selected period, which is usually 14 period for stochastic indicator, and the price is approaching the upper end of the particular asset's range. This suggests that the asset may be overvalued or expensive, and there is a good possibility that a price reversal or correction may be imminent. Likewise, an oversold condition occurs when the closing price of an asset has been consistently low over a recent selected period and is approaching the lower end of the particular asset's price range. This suggests that the asset may be undervalued or cheap, and there is a good chance that a price reversal or correction may be imminent. Now, the overbought and oversold levels are determined by the settings of the stochastic indicator, which can be easily adjusted as per your requirement. Typically, the overbought level is set at 80 and the oversold level is set at 20. I personally prefer to use this default setting. Now, the idea of overbought and oversold is very simple. When the stochastic indicator is above 80, it is considered to be overbought, meaning that the stock is overvalued or expensive. And when the indicator is below 20 level, it is considered to be oversold, meaning that the asset is undervalued or cheap. Now, this overbought and oversold levels of stochastic indicator can be used as a part of our trading strategy to identify potential buying or selling opportunities. Now, let me mention a few ways in which you can put the overbought and oversold levels of stochastic to good use. Number one is to use the overbought and oversold levels as potential signals. Now, you can use the overbought and oversold levels as signals to buy or sell an asset. For example, if the stochastic indicator is overbought, it may be a potential signal to sell the asset. And if the indicator is in the oversold territory, then it may be a potential signal to buy the asset. Now, don't start commenting right now, just listen to me first. Second method is to use the overbought and oversold signals as an indication of a trend reversal. Now, you can use these levels as an indication of trend reversal, meaning that if the stochastic indicator provides an overbought signal and if the asset price starts to decrease, then it can be a signal that the uptrend is over and a downtrend may be starting. Similarly, if the stochastic indicator is oversold and if the asset price starts to increase, then it can be a signal that the downtrend is over and that an uptrend may be starting. But it is better to use both these methods in conjunction with other indicators or price action. And one price action method that you can use in tandem is to look for a break in the trend structure. That is, an uptrend structure is considered to be broken when the price breaks and closes below the higher low, while a downtrend structure break happens when the price breaks and closes above the lower high levels. You can learn about market structures and a lot more in my free price action trading course. Now, the third method is to use overbought and oversold as an indication of trend continuation. Traders can use these levels as an indication of trend continuation. That is, if the stochastic indicator is overbought and if the asset price continues to increase, then it can be a signal that the uptrend is continuing. Similarly, if the stochastic indicator is oversold and if the asset price continues to decrease, then it can be a signal that the downtrend is continuing. But I'm not a big admirer of this particular method, because I would rather trade trend continuation with the help of RSI signals rather than stochastic signals. Now, let's go to the second use case of this indicator, that is bullish and bearish divergences. You may already be aware of what divergences are, but briefly speaking, divergences form when a new high or a new low in price is not confirmed by the indicator, or in other terms, the price and the indicator gives opposite signals or contrary signals. Specifically, a bullish divergence forms when the price records a lower low on the down move, but the stochastic oscillator forms a higher low. This shows a decreasing downside momentum or a weakening of the sellers, which could in turn predict an upcoming bullish reversal or correction. On the other hand, a bearish divergence forms when the price records a higher high on an uptrend, but the stochastic oscillator forms a lower high. This indicates decreasing upside momentum or the weakening of buyers that could predict a potential bearish reversal or correction. Now let's look at how we can spot divergences using the stochastic indicator. First of all, you have to add the stochastic oscillator to your chart, and it will typically have two lines, like I said, that is %K and %D lines. Now you have to focus on the %K line if you are using either the fast or the slow stochastics. Now you have to look for the %K line to make a higher low, while the underlying asset price makes a lower low. This divergence can indicate that despite the price moving lower, the underlying momentum as indicated by the stochastic oscillator is getting stronger. This is a bullish divergence signal indicating that a potential trend reversal to the upside is possible. Similarly, you have to look for the %K line to make a lower high while the underlying asset's price makes a higher high. This divergence can indicate that despite the price moving higher, the underlying momentum as indicated by the stochastic oscillator is getting weaker. This is a bearish divergence signal which could indicate a possible trend reversal towards the downside. So in short, if you see a bullish divergence signal, you may want to consider buying an asset. And if you see a bearish divergence signal, then you may want to consider selling the asset. But this signal as a standalone indication may not always work. It gives better results if you incorporate divergence signals with price action, like a break-in structure or a long-tailed rejection pin bar, etc. Now, another way to look for a confirmation of an actual reversal is using the center line of the indicator. For example, a bearish divergence reversal can be confirmed with a support level break on the price chart or a stochastic oscillator break below the 50 level, which is actually the center line. Now, similarly, a bullish divergence reversal can be confirmed with a resistance level break on the price chart or a stochastic oscillator break above 50 level. Now, this 50 level is an important level to watch out for. We know that stochastic oscillator is a range-bound indicator that moves between 0 and 100, which makes 50 the center line. You can think of it as the 50-yard line in football. So a particular team has a higher chance of scoring a goal when it crosses the 50-yard line on either side. On the same note, when the stochastic oscillator crosses above 50, it signals that prices are trading in the upper half of their high-low range for a given look-back period. Conversely, a cross below 50 means that prices are trading in the bottom half of the given look-back period. But being a price action-based trader, I like my odds when there is a price action signal associated with an indicator signal. You can call me a bit biased towards price action, but I have tried to explain the different ways in which you can approach a divergence. So it is up to you to decide how to use it. Now let's talk about the third use, which is bullish and bearish setups. A stochastic bull and bear setup is very similar to the overbought and oversold method. So a bullish setup occurs when the stochastic oscillator is in the oversold territory, that is below 20 level, and then crosses above the 20 level, indicating that the market may be trending upward. So in this case, a signal is generated only after confirmation that the oscillator is above the 20 level. Similarly, a bearish setup occurs when the stochastic oscillator is in the overbought territory, that is above 80 levels, and then crosses below the 80 level, indicating that the market may be trending downward. Here also, a signal is generated only after the confirmation that the oscillator has crossed below the 80 level. Now, this method is also used to identify potential buying or selling opportunities in the market. So, when you see a bearish or bullish signal, you can use this information to make trading decisions. So, if you use a bullish signal, you may want to consider buying the asset. And if you see a bearish signal, you may possibly want to consider selling the asset. Even though this looks very promising, let me warn you, there can be a lot of false signals that can be generated and thereby a lot of losses. So make sure you use other indicators and price action to improve your odds of getting a profitable trade. Now let me talk about a few common mistakes that traders make when using the stochastic indicator and discuss on how you can avoid this. And if you can avoid these mistakes, then you will save yourself a lot of money in the long run.
The first mistake is going long just because the market is oversold and shorting just because the market is overbought. I have talked about this in the previous section itself, but the crust of this statement is very simple. We know the stochastic oscillator is an indicator that measures momentum in the market. So when it is at overbought level, that is above 80, it means that the market has strong bullish momentum. And the last thing you want to do is to blindly go short just because the stochastic oscillator is overbought. And most of the time, if you go short just because the market was overbought, it would be a painful experience because the market can remain overbought or oversold for a longer period of time that you can expect. You can just take the example of Adani stocks, which stayed overbought for many months, and all those who shorted during that rally would be staying with a red account. So always be cautious with this strategy and try to use it with some other confirmation signals also. Next, let's move on to the second deadly mistake made by traders, which is ignoring the market trend. The stochastic indicator can generate a lot of false signals if the trader is not aware of the underlying trend in the market. You should always consider the current market trend when using the stochastic indicator and avoid taking trades against the trend. Usually it is better to identify trends on a larger time frame depending on your trading style and then move down to the lower time frames for taking positions. I have already made a detailed video on this topic. You can learn about time frame selections there. Now the third mistake is very common with RSI and stochastic both. It is thinking that the market will reverse just because you have spotted a divergence. Remember what you have learned. A bearish divergence occurs and the market makes a higher high, but the indicator or the stochastic indicator shows a lower high, which means that the two signals diverge from one another, right? Now, most trading textbooks, courses, etc. will tell you that when you spot a divergence, it means a reversal is about to occur. But this is not the complete truth. There are chances for reversal, I admit. But sometimes it could just be a minor correction or retracement, and on some other occasions, the market won't even care if there was a divergence. So to avoid making such mistakes, you can use the stochastic oscillator along with other technical tools like RSI. And as a general rule of thumb, when you can't confirm a reversal, it is always better to continue trading in the direction of the trend and not against it. The fourth mistake is something you might not have heard about or might not have taken into account. It relates to not considering the volatility in the asset. See, the stochastic indicator can be affected by volatility of the market. You should be aware of this and you should adjust the indicator accordingly. So when the market is experiencing a very high volatility, the stochastic indicator can generate more false signals. This is because the indicator is based on historical data, and during periods of high volatility, the recent historical data may not be representative of the current market conditions. Therefore, high volatility can cause the indicator to move faster than usual, making it harder to interpret the signals. So under such conditions, it is better to decrease the sensitivity of the oscillator by increasing the period under consideration. Moving on, the fifth mistake is not using confluences or not considering other indicators. Let me remind you, the stochastic indicator should be used in conjunction with other indicators and analysis such as support and resistance levels, trend lines, and other momentum indicators, moving averages, etc. Have you ever had the thought of having an indicator that gives the benefit of both RSI and stochastics? Fear not, we have one such indicator called Stochastic RSI, which is already available in TradingView. And as the name suggests, it is a technical indicator that combines the concepts of stochastic oscillator and relative strength index or RSI. It looks and functions just like our normal stochastic indicator, but I find it more related, though not the same, to the slow stochastic indicator that we have already discussed. This indicator is designed to indicate whether an asset is overbought or oversold, similar to the standard stochastic oscillator. However, instead of using the asset's price to calculate the indicator, it uses RSI, which is actually a momentum indicator that compares the magnitude of recent gains to recent losses in the asset's price. I won't go into the calculation part of this indicator. Maybe you can do your own research if you want to learn more. Now let's talk about some potential advantages of using this stochastic RSI as a technical indicator.
The first benefit is that we are combining the strength of two popular indicators. That is, by combining RSI and stochastic oscillator, the stochastic RSI allows you to take advantage of the strength of both these indicators. That is, RSI can help you identify the momentum changes, while the stochastic oscillator can help you identify overbought and oversold conditions. The second advantage is greater sensitivity of the indicator. Because the stochastic RSI uses RSI as its base instead of price, it is more sensitive to momentum changes than the standard stochastic oscillator. This increased sensitivity can help traders identify trend changes more quickly. In addition to these, this indicator can identify divergences better. And as the name suggests, RSI is a relative strength indicator, which makes it a great tool to identify divergences. So therefore, stochastic RSI is a great tool to identify bullish and bearish divergences. But as always, the indicator is not without drawbacks. There are several limitations of using stochastic RSI as a technical indicator, which includes false signals. And like all indicators, the stochastic RSI can generate a lot of false signals. For example, an overbought or oversold signal may not always lead to a price reversal. I have tried to emphasize this many times. You need to always look for additional confirmations. Now, the second drawback is its lagging nature. Just because we have incorporated RSI in our calculation, it doesn't mean that this is a leading indicator. Since stochastic RSI is still based on historical data, it can be slow to react to current market conditions. This lag can be especially pronounced during strong market trends or high volatility conditions. Then there is always a matter of interpretation. As the signals generated by stochastic RSI are based on relative strength calculation, the results can always be subjected to interpretation, meaning that different traders might interpret the same signal differently, leading to different trade ideas and different trade management. Another drawback which we can associate with almost all technical indicators is that it can be affected by market manipulations. That is, like all technical indicators, the stochastic RSI can be affected by market manipulations, especially in low volume markets. So always try to trade in only those instruments with ample liquidity. Now let's go to the most important part of the video, which is trading strategies or signals associated with stochastics. I will try to provide the most common signals and the ways in which traders are using the stochastic indicator. These include identifying breakout signals, trend following signals, multi-timeframe signals, and range and reversal trading strategies. Let's start with the breakout trading first. So here's the basic idea. When you see that the stochastic is suddenly accelerating in one direction and the two stochastic lines are widening, then it can signal the start of a new trend. But if you can also spot a breakout out of a sideways range on your price chart, then it is even better. Here's how you can use stochastics to find breakouts. First things first, you have to add the stochastic oscillator to your chart, which will have two lines, %K and %D. The next step is to identify areas of values around the current market price, like key levels of supports or resistances, previous highs or previous lows, or even round number levels. Then you have to look for the %K line to be either in the overbought territory, that is above 80, or in the oversold territory, that is below 20. Along with that, you have to observe whether the price is reaching a potential support or resistance level. And if you see something like that happening, the next step is to look for the %K line to cross above the 80 level while still being in the overbought territory. This can indicate a potential bullish breakout through the resistance, and you may want to consider buying the asset. Similarly, you can look for the %K line to cross below the 20 level while being in the oversold territory. This can indicate a potential bearish breakout through the support level, and you may want to consider selling the asset. You can also use other indicators and analysis and even volumes to confirm the breakout signal, and you can set the stop loss and targets accordingly. I have already made a video on how to set a logical stop loss. You can watch it to learn more. Moving on to the second method, which is the trend following strategy. The idea is quite straightforward. As long as the stochastic is above 80 overbought levels, it confirms a strong bullish trend, and a stochastic below 20 oversold level points to a strong bearish trend. So during strong trends,
that is when the stochastic is in the oversold or overbought area, don't try to fight the trend. Instead, try to follow the trend, hold on to your trades and stick with the trend. I know this is a vague way of explaining. You could ask me, how will we identify a strong trend in the first place, and when should we apply this method? Now, the most important thing to keep in mind is to trade with the trend and not against it. One way to do this is using a combination of 200 period simple moving average and stochastic to predict market turning points. So, if the price is above the 200 period simple moving average, it means that the overall market sentiment is bullish. Then we will only look for long trading setups, and we will enter a trade when the stochastic line is turning up from the 20 oversold level, and we will remain in the trade until the stochastic indicator moves below the 80 overbought levels, meaning that we will stay in the trade as long as the uptrend persists. On the contrary, if the price is below the 200 period moving average, meaning that the overall market bias is bearish, then we will only look for short trading setups, and we will enter a trade only when the stochastic is turning down from the 80 overbought levels, and we will remain in the trade until the stochastic indicator once again moves above the 20 oversold levels, meaning that we will ride the trend as long as the downtrend persists. This can help you better time your entry and trade with the trend. One more way to further improve the chances of a successful trade is to include support and resistance levels also. So when looking for a long trade setup, in addition to other two steps, make sure to take a trade from a previous support level. This will also help to figure out a very tight and logical stop loss in case the trade don't work out in your favor. And if you're looking for a short trade setup, then try to take an entry from a previous resistance level. The number of trades might reduce because of this, but it will definitely give good rewarding trades. Now moving on to the third strategy, which is using multiple time frames. Whatever your trading style is and whichever time frames that you use for your trading, keep in mind that whenever you think about a trade, you want to know where you are with respect to the big picture. Now, what is this big picture anyway, and why is it important? Big picture refers to the higher time frame depending on your trading style. Maybe you are an intraday trader with a trade entry time frame of 5 minutes, then possibly 1 hour time frame is your higher time frame. The reason why we should care about long-term trend is because if you want to find high probability trades, then you want to be trading with the higher time frame trend and not against it. Now the question is, how do you do it? And how will you use the stochastic indicator to filter your trades? Here's how. Let's say you want to go long on the 1 hour time frame, which is your trade entry time frame. But before you do so, you will have to check the daily time frame, which is your trend time frame, and see where you are in the big picture. The idea is to make sure that the higher time frame trend is in alignment with the lower time frame trend. That is, you want to make sure that the daily time frame is not in a downtrend and with the stochastic indicator overbought. So if this is the case, then the market is likely to head lower and you don't want to be entering a long position in the 1 hour time frame. So once you look at the higher time frame, you will realize if something is right or not. In this particular case, we can see that the higher time frame is in a downtrend and the stochastic is at an overbought level. So the chances are the market is likely to continue trading lower and you don't want to go long in your 1 hour trade entry time frame. Instead, what you should do is that if your daily time frame is in a downtrend with stochastic being overbought, then you will only look for short trading setup on your lower time frame. Your entry trigger can be any bearish signal like a bearish breakdown from support level on 1 hour time frame or anything else. Similarly, you can derive a setup for high time frame uptrend and stochastic at oversold levels also. Now let's talk about the final strategy, which is a combination of support resistance, stochastic and reversal setups. Let's say the price is moving up and down within a range. Most technical indicators will not work properly in such choppy price action, be it moving averages, RSI, MACD, but not stochastics. If you search the internet, books, courses, anything, they will tell you that the best time to use stochastic indicator is in range markets. And there is a reason why they are telling this. Because you can wait for the price to be overbought before shorting from a resistance level, and you can wait for the oscillator to give an oversold signal before taking a long trade from the support level. And from the looks of it, it seems that the stochastic indicator can pinpoint the tops or bottoms of a range with deadly accuracy. This is a form of reversal trading from a level of importance. But here's the thing, you should not be trading all the ranges. Think about the general idea of placing your stop loss and targets when it comes to trading ranges. We will always try to keep stop losses beyond the level from which we are taking a trade, or we will place our stop loss beyond the deepest wick of that range. And when it comes to targets, the opposite level from which you have taken an entry is generally your target. So if you have shorted from the resistance, then support level of the range is your target level. But one thing which is often missed out is the reward to risk, meaning your trade should have at least a 2:1 reward to risk ratio. This in turn means that you should have a range that is wide enough that could provide you with the appropriate reward to risk. This in turn means that you should avoid trading narrow ranges. In addition to this, you can make use of price action candlesticks to better time your trade entries. Candlesticks like deep wicked pin bars, morning stars or evening stars, engulfing patterns, etc. from the support or resistance level is a good sign for a possible price reversal, and when you combine this with the oversold and overbought signals, you can get a good trade. Now, in the final section, we will talk about how to combine stochastics with other tools or indicators. Now, as with any other trading concept or tool, you should not use stochastic indicator all by itself. To receive meaningful signals and improve the quality of your trades, you should combine the stochastic indicator with other tools. I will talk about 3 such tools. Number 1 are moving averages. Moving averages are a great addition and they can act as filters for your signals. We have talked about this in the previous section as to how you can filter trades using a 200 period simple moving average. You should always try to trade in the direction of your moving average, and as long as the price is above the moving average, you should look for long trades only, and when the price is below the moving average, you should look for short trades only. The second tool is to use price patterns. As a breakout or reversal trader, you should look for chart patterns like wedges, triangles, head and shoulders, rectangles, etc. I have already made a 3-hour-long video on chart patterns, and you may want to check that out to learn more. You'll find all these mentioned videos in the I button. When the price breaks such a chart pattern, it comes with momentum and in turn with an accelerating stochastic, which can potentially signal a successful breakout. Now, the last tool we can use are trend lines. This works especially well when we are trading stochastic divergences or stochastic reversals. First of all, you need to find an established trend with a valid trend line, and you have to wait for the price to break it with the confirmation of your stochastic indicator. Although stochastic indicator is a very simple tool and only looks at a very few data points on your chart, it can still provide meaningful trend and momentum information. Also, I want to highlight the importance of getting to know your trading tools. A wrong understanding and a wrong application of your trading tool can lead to incorrect trading decisions. So, it is essential that you take your time to fully understand the indicators or tools that you're using.
We will take a look at the VWAP indicator, which is a special indicator when compared to other available indicators in the market. This will be a very informative video, so do watch it till the end. And if you haven't subscribed to the channel yet, please make sure to subscribe. Well then, here is what we will discuss in this video. We will talk briefly about VWAP and the basic information related to VWAP. Then we will move on to understanding why VWAP is better than other technical indicators. Then we will have a brief discussion on the core concepts of VWAP. We will also be talking about the uses of VWAP and the importance of VWAP bands. Not to mention, we will also discuss about the disadvantages of using VWAP. And finally, we will wind up the video with 3 VWAP strategies that you can use to trade in the market. So without wasting any time, let's get started. VWAP stands for Volume Weighted Average Price. VWAP is commonly used as a benchmark indicator, and it is derived from a ratio of average share price for a stock when compared to the total volume of shares traded over a particular time frame. The indicator is most commonly used by short-term traders and algorithm-based trading programs. The indicator helps analysts and traders evaluate the current price of a stock and determine whether it is relatively overpriced or underpriced compared to the average trading price for the day. What makes VWAP so popular is that it is used to measure the trading performance of smart money or large institutions. Professional traders who work for investment banks or hedge funds are required to trade large numbers of shares each day. So they cannot enter or exit the market by simply buying or selling a large position at any given prices. So these institutional traders compare their prices to the VWAP values. So when a buy order is executed below the VWAP, it would be considered as a good order filling because the stock was bought at a below average price, meaning that the trader has bought their large position at a relatively discounted price compared to the price that is available in the market. So VWAP was and is used by institutional traders to identify good entry and exit points in the market. On the other hand, when a professional trader has to get rid of a large position, they try to sell the position at a price which is higher than the VWAP price. So in short, what we can understand is that VWAP is an intraday indicator that can be used to help investors decide whether to adopt an active or passive approach to enter their positions. So many traders also use VWAP to help them buy at a relatively inexpensive price and further sell them at a comparatively higher price. Now let us briefly look at how VWAP is calculated. VWAP is calculated using the opening price for each day and adjusting in real time right up until the close of the session. Therefore, the calculation uses only intraday data, and the formula for calculating VWAP is as follows. VWAP is equal to cumulative typical price multiplied by volume, the whole divided by cumulative volume. Now, the breakdown of this calculation is quite extensive and which is not great use for us. So rather than dwelling deep into these calculations, we will try to focus on the application side of this indicator. Since the VWAP calculation is based on historical data of price and volumes, it is considered as a lagging indicator. But this does not stop traders from using this indicator to establish support or resistance level which is suitable for intraday trading. And on top of this, because institutional traders use VWAP as a benchmark for their execution activity, VWAP price level is considered to be highly influential in the intraday price action. Now let us see why VWAP is a superior indicator or what is the significance of VWAP. Now VWAP combines price and volume together in its value. Therefore, analysts consider VWAP to be a more true representation of the average price of stock. One of the most important features of VWAP is that it is cumulative in nature, while most technical indicators are periodic in nature over the recent number of candles. To understand this simply, think about a chart as a painting, which is drawn candle by an artist. Imagine if you could only see the last 9, 10, 20 or 50 candles made by the artist on the chart, while everything before that disappears from the view as he continues painting. How would that feel? You will not get the feel of the entire picture, right? So this is the same problem with periodic indicators. Data from beyond the arbitrary look-back period you have selected is no longer factored into the calculation, which means if you have selected a 9 EMA or 20 SMA, only the previous 9 bars or the previous 20 bars are considered for calculation, which leaves you with an incomplete picture of the market. Now when it comes to VWAP, its cumulative nature allows you to see the entire painting develop over the course of the day while factoring in each and every candle. And no piece of data gets left behind, which leaves you with a realistic picture of the market. Moreover, VWAP isn't susceptible to changes in length, type, or time frame, unlike moving averages. What this means is that, in addition to providing an increased context, the cumulative calculation of VWAP prevents confusion regarding the selected chart timeframes and indicator settings that exist in nearly every other piece of technical analysis indicator. It doesn't matter if you use VWAP in a 1-minute chart, an hourly chart, or anything in between. There is only one intraday VWAP. It does not change with time frame because the factors that were taken for calculation was just the price and the volume. So flipping between the time frames will not affect the calculation and the calculation remains constant. The same can't be said for periodic indicator. For example, a 20-period moving average on a 1-minute chart will look drastically different than what it would look like in a 1-hour chart. There are a few core concepts that are associated with the VWAP indicator. Number one is that VWAP behaves like a magnet, which means it either attracts or repels. So our main objective should be identifying the market style. That is, if the price is moving towards the VWAP or away from the VWAP. There is this myth in the market that price is always attracted towards the VWAP, but this is not true in every case. And such an interpretation will lead to an oversimplified approach when using the VWAP. If we go by this approach, shorting stocks that trade too far away from VWAP and buying those that fall too far below the VWAP, with the exception that a reversal is imminent. So if these conditions were true, we would never witness sustained trends or uptrends or downtrends in the market. Now the reality is that price can either be drawn towards the VWAP or it can be actively repelled from it. So you have to understand this magnetism concept associated with VWAP, or else you will find yourself trading in the wrong side of the market and thereby making a loss. Now the second concept associated with VWAP is that VWAP has inertia, or in simple words, it has the tendency to continue whatever it's doing. Now what this means is that we have given volume the equal weight in calculation of VWAP. So VWAP is intuitively more responsive to price movements on significant volume. So as VWAP absorbs more price and volume data over time, it becomes more resistant to random oscillation and sudden shifts. So this allows it to accurately reflect only meaningful changes in the market's value, and it increases its credibility as a reliable reference point. This is what is meant by the inertia of VWAP, where its resistance to change make it significantly more reliable than other short-term indicators which randomly gives out buy or sell signals every couple of minutes. Moving on, let us discuss some of the important uses of VWAP. Number one, VWAP can be used to determine the market trend. So for bullish trending days, the market usually stays above the VWAP. And for bearish trending days, the market stays below the VWAP. And for ranging sessions or ranging days, the market stays almost around the VWAP indicator, which remains more or less flat. Now, these observations show that VWAP has a great potential for helping traders identify the market tide during an intraday activity. Another way of determining the market trend using VWAP indicator is by paying attention to the slope of the VWAP. So in a trending session, the slope of the VWAP will stay positive or negative throughout the session. On the other hand, when it's a ranging market, the market fails to move away from the VWAP, and the VWAP will have a relatively flat slope, meaning that there is not much trending action. Now the second use of VWAP is that it can be used as a support or resistance zone. When price is above the VWAP line will act as a support. On the other hand, when the price stays below the VWAP line will act as a resistance to the price. Now the third and final use of VWAP is that VWAP shows who is in control or who is the dominating force in the market. So when a stock is traded above the VWAP, it means that buyers are in overall control of the price and there is a buying demand on the stock. And when a stock price breaks and closes below the VWAP, it is safe to assume that the sellers are gaining control over the price. So in short, when VWAP is rising, then buyers are in control. If VWAP is falling, it shows sellers are in control. And if VWAP is flat, then it indicates that no one is controlling the market and the price is in a trading range. The VWAP bands or the standard deviation bands associated with the VWAP indicator can save your money big time. So the idea of just buying when the price is above the VWAP and selling when the price is below the VWAP is drastically oversimplified. So in order to make meaningful trades, we can make use of standard deviations in association with VWAP. Now standard deviation in short is a statistical tool which is used to quantify the variance in a dataset. Now by applying this standard deviation tool to trading with VWAP serving as the average line, we can plot these deviations as bands. an upper band and a lower band, to create a visible unit of measurement and characterize the market movement within these bands, and also to gauge the volatility. Now this looks like a Bollinger Band, but trust me, this is better than a Bollinger Band, because in Bollinger Bands the average line is a moving average, but in case of VWAP, the average or the mean line is actually a VWAP line, which in turn is an average value generated from the calculation of prices and volumes. So it holds more weightage than a moving average. Now you can find this VWAP indicator with bands in the TradingView site, and the deviation bands are automatically plotted and it gets adjusted as we receive more data throughout the day. If you look at it, at the market open, they typically start off small and then expand as the price begins to break away from the market average. The rate at which these bands change depend upon how far the price is away from the VWAP and how much volume is being transacted to. So applying VWAP and the deviation bands to a chart creates a grid-like system which allows you to categorize the market activity into different zones. And each region has unique characteristics and different expectations. What this means is that it helps you identify if the market is good enough to go long or to go short, or if there is no identifiable trend. This will in turn allow you to have a superior reframing on how you look at a chart. Now I have mentioned about the 4 zones that the VWAP would generate. The first zone is above VWAP, but it is beyond the first standard deviation, and in this case the market is expected to continue uptrending. If the price is above VWAP but it stays between the VWAP and the first standard deviation, then it is expected to oscillate around the VWAP. Similar is the case when the price is below the VWAP and it is between the VWAP and the -1 standard deviation, then the price is expected to oscillate around the VWAP. And finally, when the price is beyond the VWAP and it is lower than the -1 standard deviation, then the market is expected to be downtrending. Price crossing between these VWAP zones is also a noteworthy event, because more often or not, there is some sort of a resistance when the price crosses these zones. These zones expand when the price sustains a trend, and it contracts when the price consolidates towards the VWAP. Now moving into the disadvantages of VWAP. VWAP is a lagging indicator because VWAP is more sensitive to price and volume changes at the beginning of the session, but it becomes less responsive as the session progresses. This is called as progressive lag. Due to this progressive lag, VWAP might not be an appropriate indicator for timing the market entries. Or in other words, it requires a supporting price action for entry, or knowledge about price action is very essential while using this indicator. Another shortcoming is that it can be only used in the intraday time frame only. If you try to use it for more than a day, it will not be able to portray the correct trend. And it cannot be used at the opening of the day, meaning that VWAP will be in line with the price and it will only expand or move away only when the session proceeds. Now finally, let's talk about the strategies. In this video, we will talk about 3 strategies. Number 1 is a pullback strategy. Number 2 is a reversal strategy. And finally, a mean reversion strategy. Now, a word of caution before using VWAP strategy is that you should avoid trading VWAP at the opening of the trading session, which means after the market opens, the price bars tend to overlap the VWAP. So in the first 5 minutes, due to heavy trading happening in the market, you cannot judge the market bias until the market tries to move away from VWAP. So after volatility decreases around 10 to 15 minutes into the open, the stock price will move towards or away from the VWAP. So you should stay out of the markets until the prices diverge sufficiently from the VWAP. Now I'm going to give you some general conditions before taking a trade. Number 1, do not try to go long when the price is below the VWAP, and do not try to short a stock if the price is above the VWAP. But there is a catch. If the prices are extended way far from VWAP, then a reversal is okay or a mean reversion is okay, but the target has to be set as the VWAP line. We will discuss the mean reversion strategy soon enough. Now, most important point, use VWAP indicator with price action and volume. The first strategy that we'll be talking about is the VWAP first pullback strategy. Now this strategy should be used in trending market. Let us take a look at this strategy in terms of an uptrending day. So the first step is to find out if the stock is in a clear uptrend or a downtrend, depending upon where the price is with respect to the VWAP line. After that, you need to look for at least 2 to 3 candles in the same direction above the VWAP. After that, you have to wait for the price to approach the VWAP line for the first time. That is, a pullback to the VWAP should happen, and then look for a push away from the VWAP line. What this means is that the price should not stall at the VWAP or consolidate. Rather, it should push away from the VWAP. You can also look for a deep rejection from the VWAP line. And finally, observe that if the upside push follow through higher, or is it rejected back to the VWAP level from the previous swing high level in case of an uptrend. And if the price manages to break above the previous high, you can take a long entry or initiate a buy order, keeping a stop loss below the rejection candle. And when the move turns out to be in your favor, you can keep a trailing stop loss below the VWAP line with suitable buffer. You can exit the trade when the price moves below the VWAP line or hits your trailing stop loss. The same strategy can be used in downward trending markets also, just by changing the rules. Now the second strategy is a reversal strategy. In this case, we will talk about a VWAP reversal towards the upside. Here are some of the criteria of this strategy. The previous day should be an uptrending day or a bullish day, and the price should not close below the last swing low. Now we will draw a horizontal line from the VWAP level of the last candle of the previous day, and we can name this as the PVWAP level. For a buy-side trade, the price should close above the VWAP level. Look to see in the morning if the price moves into the previous day VWAP or the PVWAP level. The volume of this move is also important. Preferably, low volume move is the best. The price opens and moves down with lesser volume and stalls at the PVWAP level and is unable to close below the PVWAP. This is very important. That is, the price should not close below the PVWAP. Look for a push away from the PVWAP level. If the upside push follow through higher, then look to take a long entry or initiate a buy order. It is best if we make use of price action. We will take the trade only if we get a good entry and good risk to reward ratio by keeping the stop loss below the PVWAP level, and when the price moves in your favor, keep a trailing stop loss below the VWAP level with suitable buffer. You can also make use of the VWAP's upper band to book your profit. That is, when the price reaches the upper band, you can exit the trade. Now the last and final strategy is the mean reversion to VWAP from the standard deviation band. This is a very useful strategy that can be used in ranging markets or when the price is very much overextended from the VWAP level. The idea is to take a buy or a sell entry from the second standard deviation band, keeping the VWAP line as the target. Now you may ask why the second standard deviation band and not the third band or only the first band? Now the answer is very simple and can be explained using the normal distribution curve, where a single standard deviation band above and below the VWAP will cover only 68% of the price move, while the second standard deviation band encompasses more than 95% of the price move. Even though the third standard deviation bands predicts over 99% of the price moves, but such moves are rare in occurrence, and so you might not get a suitable entry as the price might return to the mean line before testing the third standard deviation bands, which means you will not get a lot of trades if you use the third standard deviation band. Now the trade idea is simple. We will wait for the price to test the second deviation band either from above or below the VWAP line. Now keep an eye on the price action formed. If the candle formed at the band shows some sort of a rejection and then goes on to form a reversal candlestick pattern. For example, if the price is at the lower standard deviation band and the price rejects lower prices and forms a hammer candlestick. This can be a confirmation for taking a long entry if the next candle crosses above the high of the hammer candle. Now the strength of this strategy is higher when the reversal happens near an area of value like a support or resistance where there is enough liquidity for the move to happen. The stop loss for this trade would be below the hammer candle or below the support level in case of this example. For a short trade, the setup is similar, but we have to look for a rejection from the upper VWAP band and look for a bearish reversal candlestick, more preferably near a resistance level. The stop loss can be placed above the rejection candle or above the resistance level with suitable buffer. The target in both these setups is the VWAP line itself. The primary goals of technical analysis in trading is to identify a probable trend or a counter trend that is expected to continue, and then provide a suitable entry at the trade at a credible support or resistance level with a predefined risk, and further monitor the likelihood of the continuation or a reversal to optimize your exit. Now, if you ask me, VWAP meets all these criteria. The VWAP along with the band system helps you to forecast the market direction and also predict the dynamic supports and resistance level, thereby giving clear-cut risk levels that we can use both initially to enter the trades and also to actively manage them as we progress with our trade. Now, VWAP in no way is the holy grail to trading, but it has got some exceptional utility. The thing is, it won't save you from undisciplined trading. VWAP is a superior indicator and it is recognized by institutions.
Are you one of those traders who is tired of placing stop losses that get triggered again and again only to see the price move in the exact same way that you wanted it to move? It's quite frustrating actually. I have already talked about the concept of placing a logical stop loss for your trades. It is a very good video to start with if you have no idea how to place stop losses for different trading scenarios. One thing that I missed on that video was the concept and application of a stop loss specialist. Yes, it's none other than the ATR indicator. I have made a video on ATR a long time ago, but it was not a very comprehensive video. So I thought, why not make a detailed video on the basic concepts and applications of the ATR indicator. These are going to be the topics that we will be discussing in this video. We will start from the basics of ATR, including the guiding principles of ATR indicator to its calculation, the shortcomings of ATR, and a few observations, and finally, we will go in depth into the applications or uses of ATR. Let's start from the very basics. What is ATR? The average true range or ATR is an indicator that measures volatility in the markets. It was developed by J. Wilder, who is undoubtedly one of the biggest contributors to technical analysis, and he mentioned about ATR in his book New Concepts in Technical Analysis Systems, which was published in 1978. Unlike indicators like Bollinger Bands or moving averages, the ATR is usually plotted below the price rather than on or over the price. The ATR indicator talks about the market volatility only and nothing more than that. It does not indicate the direction of the trend or the momentum, but just the volatility. And why do you have to care about market volatility in the first place? To put it simply, volatility is a measure of price fluctuations in the market. If there is high volatility, then price swings happens very quickly and unpredictably, resulting in high risk, high reward trading conditions. And while during low volatility conditions, the price swings are more calm and relaxed, so both the risk and reward drops significantly. But the real reason why you need to be bothered about volatility is due to targets and stop losses. Let me explain. Do you think a tighter stop loss would work in a highly volatile market condition? And similarly, do you think a very wide target is likely to get achieved in a low volatile market? The possibility of them working in the favor of your trade is very dim. This is where the ATR indicator comes into picture. We will talk about all this stuff as we move further forward in this video. But for now, let's look at how the ATR indicator is calculated. This is an important step because it gives you clarity as to how the indicator functions and why it will work in real market condition. And this is also one of those things that I need you to be cautious about, since there are a hell lot of indicators flying around these days giving out buy and sell signals, but nobody shares the logic behind them even if you pay for them. So always make sure that you know what the basic idea behind the indicator is before you use them, right? Let's look at the calculations now. How are ATR values calculated? Well, it can be done using one of the three methods depending on how the candles are formed. To calculate the average true range, the first step is to calculate the true range or TR. For doing this, the current price bar is compared either to itself or to the previous bar's close price, and the true range is taken as the greatest of the following calculations. So here's how you should do it. The first method is to subtract the current candle's low price from the current candle's high price. The second method is to find the absolute value of the difference between the current bar's high and the previous candle's close price. And finally, the third method is to find the absolute value of the difference between the current bar's low price and the previous candle's close price. And as I have mentioned, the true range will be the maximum of these three values. Now, there is a reason why we use absolute values in methods 2 and 3. It is just to ensure that the final result is a positive number. After all, Mr. Wallace Wilder was only interested in measuring the distance between the 2 points and not really the direction. So if the current period's high is above the prior period's high and its low is below the prior period's low, then the current period's high-low range will be used as the true range. This is referred to as an outside day that would use method 1 to calculate the true range. This is a pretty straightforward method. Now, methods 2 and 3 are used either when there is a gap or an inside day, where the high and low range of the current period candle is within the previous candle's highs and lows. So if a gap occurs when the previous close is greater than the current high, it signals a potential gap down, or when the previous close is lower than the current low, it signals a potential gap up. So you can learn more about gaps and how to trade them in my price action playlist. Now let us understand these three methods with examples. So in the first example, the current candle's range is larger than the previous candle, which means an outside candle is formed. So we will use method 1. That is to find the difference between the current candle's highs and lows. Now in the second example, you can see a small higher-low range formed after a gap up. In this case, the true range will equal to the absolute value of the difference between the current high and the previous close. And in the third example, there is a small higher-low range formed after a gap down. In this scenario, the true range is equal to the absolute value of the difference between the current low and the previous close. Now let's consider a final example to understand things better. Look at this. Even though the current close price is within the previous higher-low range, the current higher-low range is quite small. In fact, it is smaller than the absolute value of the difference between the current high and the previous candle close, which is quite obviously the true range. Now typically, the average true range is based on 14 periods and can be calculated on an intraday, daily, weekly or monthly basis. But by default, most charting platforms use a 14-period ATR. For this example, the ATR will be based on daily time frames. Let us take a look at the general method for finding ATR first. Since there must be a starting value, the first true range value is simply the high minus the low of the first candle under consideration. Once the true range is computed for the desired period, the ATR can be calculated as the average of the true ranges over the past n periods under consideration. Now the formula that is used to calculate the current period ATR is given by current period ATR is equal to previous period ATR multiplied by n-1 plus current period true range, the whole divided by n. So for instance, in case of a 14-period ATR, n will be equal to 14 and n-1 will be equal to 13. While in case of a 7-period ATR, n will be equal to 7 and n-1 will be equal to 6. The first 14-day ATR is the simple average of the daily true range values for the past 14 days. From the next period onwards, each current period ATR is smoothed by incorporating the previous period's ATR value. Or simply, in case of 14 periods, the current ATR is equal to prior ATR multiplied by 13 plus current true range, the whole divided by 14. This simply means that you have to multiply the previous 14-day ATR by 13, then add the most recent day's true range value, and then finally divide the total by 14. So what are the key takeaways from these calculations? First point, the larger the range of the candles, the greater the ATR value, and the smaller the candle's range, the smaller the ATR value. Second observation, as the volatility expands, the ATR indicator would point higher, because when you look at the range of candles, they are increasing over time because volatility is associated with large price swings and candles. So basically, the larger the range of the candles, the larger the ATR value is going to be. Now, let me talk about a few mistakes that traders are likely to make when dealing with the ATR, or maybe let's talk about a few drawbacks of ATR. First of all, ATR is not a trending indicator. A rather common mistake that traders make while using ATR is assuming that the volatility and trend go in the same direction. But this is not right. Recall the fact that average true range indicator measures the volatility of the market. This means volatility can be low while the market is trending higher, and it can be the other way around. So the thing that I want to point out is that ATR indicator does not tell you the direction of the trend. This is not a trend indicator that tells you whether the trend is going to go up or down. So let's take a look at a case where the market is clearly going higher, but the ATR value here is going lower. So as I have clearly stated just now, the ATR indicator measures volatility in the market. It only looks at the range of the candles. In this case, you can see the range of the candles is getting smaller, and that is exactly the reason why the ATR indicator values are decreasing. So don't presume that if ATR line is rising, it means the price must be in an uptrend. It's not necessarily true, because the price could either be in an uptrend or in a downtrend. So to identify trend, either look into price action or use other trend-based technical indicators. What the ATR tells us is that if ATR line is rising, volatility is increasing, and if ATR line is falling, volatility is decreasing. Now the second drawback is that ATR values of different stocks or indices cannot be compared. Now ATR is based on the true range, which uses absolute price changes. As such, ATR reflects volatility as an absolute level, or in other words, ATR is not shown as a percentage of the current close price. This means low price stocks will have lower ATR values than high price stocks or indices. For example, Reliance stock has an intraday ATR value ranging between 25 to 85, while Tata Motors stock have a much lower ATR value between 5 to 25, while index like Bank Nifty have a much higher ATR value ranging anywhere between 400 to 1500. So because of this, ATR values of different assets cannot be compared. Now let me talk about a few observations of ATR indicator. First of all, ATR is not a directional indicator like MACD or RSI, but rather a volatility indicator that reflects the degree of interest or disinterest in a price move. Strong price moves in either direction are often accompanied by large true range values due to long-ranged candles. This is especially true at the beginning of a price move. On the contrary, weak price moves, as you may have already guessed, are accompanied by relatively narrow ranges. So as such, ATR can be used to validate enthusiasm or interest behind a price move or a breakout or a reversal. For example, a bullish reversal with an increase in ATR values would show strong buying pressure, and it will reinforce the reversal. Similarly, a bearish support level breakdown with an increase in ATR would show strong selling pressure, and it will reinforce the support level break. Now, if you are someone who uses ATR on an intraday chart, such as in 1 minute or 5 minute or 15 minute time frame charts, then usually ATR will spike higher right after the market opens. When major exchanges like NSE and BSE opens at 9:15 am, the ATR moves up during the first minute, and that is because the open is the most volatile time of the day, and the higher ATR simply indicates that the volatility is higher than it was at the previous day's close. Now, after the ATR spike at the open of the day, the indicator typically spends most of the day declining. The oscillations in ATR indicator throughout the day don't provide much information except for how much the price is moving on an average each minute. In the same way, you can use a daily ATR to see how much an asset price moves in a day, while intraday traders can use 5-minute or 15-minute ATR to estimate how much the price could move in 5 or 15 minutes. This simple strategy could help establish profit targets or stop-loss orders, which we will discuss next. Let's start with setting up stop-loss using ATR to counter price volatility. Now let me ask you something. Are you one of those traders who is tired of getting stopped out of your trades prematurely? Now the reason for this is pretty simple. It is because you are using one of the simplest stop losses called the hard stop loss, in which you simply place a stop loss a certain number of points from your entry point. this is not a very logical method of placing a stop loss. Moreover, having a hard stop loss in a dynamic market doesn't make sense. Think about it. Why would you place a 20-point stop loss in both a quiet and volatile market? Similarly, why would you risk 80-point stop loss in both calm and volatile market conditions? Your stop loss will greatly depend on the nature of the asset that you're trading on. You can't just keep the same stop loss for a similar trade for a wild index like Bank Nifty and a more calm index like Nifty. And that's because your stop loss may be too tight for Bank Nifty because Bank Nifty is a more volatile index. So what is the solution? The simple hack is to give your trade breathing room. This means your stop loss should be wide enough to accommodate the price swings of the market. Now you might be wondering, how much is wide enough for my stop loss? Well, here's where you can use the ATR indicator to help you. ATR is an excellent tool for determining the size of a stop loss at the time of entering your trade. Because it measures the volatility, it informs you about the magnitude of stop loss that must be placed when a trade is entered. So a high ATR reading is indicative of high volatility, and it tells you that a wider stop loss must be placed to avoid getting whipsawed. Similarly, a low ATR reading is reflective of low volatility and tells you that a narrow stop loss is enough due to the lack of directional trend in the market. Actually, there are two ways in which I use ATR for setting my stop losses. The first method is very straightforward. All you have to do is to find out what the current ATR value is. Then select a multiple of ATR value. So a multiplier of anywhere between 1 to 3 is good enough. And finally, add or subtract that amount to the nearest resistance or support level from which you have taken a trade entry. So if you have taken a long trade from a support and you have a multiplier of 1, then set your stop loss 1 ATR below the lows of the support. Or if you have taken a short position from the resistance and you have a multiplier of 2, then set your stop loss 2 ATR above the highs of the resistance. You can also use this method when referencing a deep candle's wick or a price pullback or retest, etc. The concept remains the same. You can tweak the value of the multiplier as you like depending on your risk-taking ability. Now, this is a very good method for both intraday and swing trading. But there are times when it is not practical to use a 100-point stop loss. It affects a trader's position sizing and reward to risk, especially if you are an intraday trader. Moreover, the price has to move at least 100 points to give a 1:1 reward to risk. So in such a situation, even with a multiplier of 1, the stop loss as well as the risk associated with a single trade is very high. Therefore, in such scenarios, the ATR multiplier method doesn't make much sense. That's when we have the second method, which is the ATR percentage stop loss method. As I have already mentioned, a higher ATR indicates a more volatile market, while a lower ATR value indicates a less volatile market. Now, by using a certain percentage of ATR, you can ensure your stop loss is dynamic and it changes appropriately with market conditions. For example, let's say for the first 4 weeks or first 4 days, depending upon the trading type and time frame that you follow, you notice that the average daily ATR range was around 25 to 65. In such a scenario, an intraday trader wants to use 10 to 50% of the ATR stop loss, meaning that the stop loss is placed 10 to 15% of the ATR value from the entry price. So if we take 50%, then the stop loss would be anywhere from 13 points to 33 points from your entry price. Now a swing trader might use 50% or 100% of the ATR as stop loss or follow the conventional ATR multiplier method. Let's say the daily Reliance ATR range from April 2022 to September 2022 ranges anywhere between 46 to 84. As such, a swing trader who uses 15% of ATR value would have its stop loss of 23 points to 43 points from the entry price. Now with that clear, let's learn how to use ATR to write trends in the market. Here we will make use of the concept of volatility stop losses. I have already discussed this particular concept in my how to set a logical stop loss video. But to give you a brief context, a trailing or volatility stop loss is a way to exit a trade if the asset price moves against you, but it also enables you to move or trail the exit point if the price is moving in your favor. Because during trending markets, you will get big price moves and more profitability, and who would want to miss such an opportunity? So many intraday traders and swing traders use ATR to figure out where to put their trading stop losses. At the time of a trade, look at the current ATR reading. The thumb rule is to multiply the ATR by 2 or 3 to determine a reasonable stop loss point. So if you are buying a stock, you might place a stop loss at a level twice or thrice the ATR value, just below the entry price. And if you are shorting a stock, you would place a stop loss at a level twice or thrice the ATR above the entry price. Now, if you are long and the price moves favorably, the stop loss also continues to move twice or thrice the ATR below the price. In this long trading scenario, the stop loss only moves up and not down. Once it is moved up, it stays there until it can be moved up again or when the trade is closed as a result of the price dropping to hit the trailing stop loss level. Now the same process works for short trades, only in that case the stop loss only moves down. Now let us understand this with the help of an example. Let's say the ATR value is X. What you can do is that you can decide upon a multiple of X to trade your stop loss. Let's say for example, you want to write trends and you don't know how much buffer space you should give to your trades. So if the stop loss is too tight, you might get stopped out on the price retracement or corrective moves. So you have to give it enough room or buffer space so that you can accommodate the retracement that comes along with it. So decide upon an ATR multiplier, which may be 2, 3, 4, 5, etc. So one example you can use is 5x, meaning a multiple of 5 as your average true range. So if your average true range value is 20, then multiply it by 5, then your trading stop loss is basically 100 points from the highs or lows depending on your trade type. Now if you are long, then subtract X times ATR from the highs and that is your trailing stop loss. And if you are short, then add X times to the ATR value from the lows and that's your trailing stop loss. But all these calculations and plotting is hard work. So to make your life easier, there is a very useful indicator called the Chandler stops which performs this function brilliantly. What it does is that the Chandler stop would take the highs and it calculates what is the ATR value, which is X. In this case, assume that I have used 5 as my multiplier, so I am using 5 times ATR for buffer. Now what the indicator will do is that it takes 5 multiplied by X and this is the level which is your trailing stop loss. So all you need to do is to hold on to your trade if the market is above this particular level, which is 5 ATR from the highs. And if the market does not break below it, you just hold on to your trades and it is as simple as that. Now this is a very simple tool that helps you ride massive trends in the market. So now you can ask me, which is the best ATR multiplier to use? The truth is, there is no best ATR multiplier. But there is the fact that the tighter your multiplier, the smaller the trend you will capture. And the larger the multiplier you are using, the longer the trend you will ride. It really depends upon your risk appetite as to how big of a multiple that you want to use. But as a rough guideline, if you are using a smaller ATR multiplier, then you will ride small trends and the time held on the trade is shorter. And if you use a bigger ATR multiplier, then you will ride bigger trends and the time held on the trade is longer. So if you use a multiple of 2 or 3, you tend to capture short-term or medium-term trends, and anything above 5 or more, you will be able to capture long-term trends. Moving on, let us now understand how to set targets using ATR indicator. Now if you don't want to ride trends, you can also use the ATR indicator to set a profit target. And here's how it works. We already know that the ATR indicator tells you how much a market can potentially move for a particular period by accounting the market volatility. So let's say Reliance has a daily ATR of 50 points. It means price could move on an average of 50 points on a day. This means if you are a day trader, you can have a target profit of 50 points give or take, and there is a good chance that it will be hit. Of course, you don't want to blindly set a 50 points target. Instead, combine it with market structure or areas of values like support and resistances, swing highs, swing lows, etc. so that you know where the price might reach for that day. My point is that entries and exits should not be based on ATR indicator alone. ATR is just a tool that should be used in conjunction with an existing strategy to help filter trades. Only if a valid buy or sell signal occurs based on your particular strategy should the ATR indicator help confirm the trade targets. Now let's consider another example. Let's say Nifty moves an average of 100 points a day. You went long at the support level based on a reversal strategy and you are not sure where to take profits. There are 3 possible resistance levels which you can possibly achieve your target. First is 30 points away, the second is 60 points away, and the last level is 150 points away. Which resistance level would you choose for your targets? The 30 points target is likely to hit within the day, but you are leaving a lot of money on the table as the market could move up 100 points a day on average, given there was no big news or event to trigger a gap up. While the 150 points target is unlikely to be hit within a day as it's more than the ATR value. So the 60 point target is your best option as it is within the daily ATR value and offers more profitability than 30 points level. So here's the takeaway when using ATR indicator for determining your targets. The first step is to identify the daily ATR value, and secondly, when you set your profit target, combine it with market structures, areas of values, and ensure this target distance is less than the daily ATR value. And if you are a swing trader, you can refer to the weekly or monthly ATR value for determining suitable target levels. Now let us learn a breakout technique using ATR to identify strong and explosive breakouts. As you may know, markets are always changing. It moves from a period of low volatility to a period of high volatility. Then it moves back from a period of high volatility back to a period of low volatility. It is like a cycle that repeats over and over again. This is typically how the market moves. I have explained this in my market structure video. So if you have noted, when the market is in a low volatility environment, there is a good chance that the volatility could expand in the near future, giving powerful price moves. So how do you use this knowledge to find explosive breakouts using ATR before it actually happens? Before we get into it, let me make it clear that this particular strategy works well on longer time frame ATRs, mostly on daily, weekly, and also the monthly time frames. You will understand the reason why in a little while. Basically, the idea is to pay attention to the ATR value, especially the multi-year low ATR values. Notice if the ATR value has slumped into multi-year lows. This pretty much indicates that the market is probably in a range and the volatility is shrinking to the absolute lows. So when the market finally breaks out, it comes with an expansion in volatility which is associated with strong price moves towards either the upside or the downside. Now the reason why this method is not particularly reliable in lower time frames, ATR values swings every day from highs to lows, which is not really indicative that the market is range bound. It just means that the market volatility is declining. But when we consider ATR of much higher time frames like weekly or monthly, and if the values are coming out very low in terms of a few months or years, then there is a good chance that the market could potentially be in a range, and thereby you could get a highly profitable trade on the direction of the breakout from the range. So just look at this example of Zeal stock. On a weekly time frame, whenever the stock reaches multi-year lows on the ATR value, the stock is expected to give a good price move in either direction, which is indicative of high volatility breakout trade. Swing traders and positional traders can capitalize on these volatility shifts to make much better trading decisions. So all you have to do is to check if the market is in a range, see if the volatility is low as represented by ATR, then wait until the market breaks out or breaks down, which indicates the volatility is picking up. Then plan your trades accordingly when the breakout of the range happens. So whenever the volatility is low, especially when it is approaching multi-year lows, you want to tell yourself that if the market does a breakout, a big price move could follow, and this is a very powerful trading technique. Now finally, let us learn how to use ATR to predict market reversals or price exhaustions. See, the market can't move up or fall down forever without exhaustion. Most of the time, the market will need a break to recharge just like we human beings do. This means there is a good possibility that the market could exhaust itself after hitting its limits. Now you might be thinking, how to tell where is the limit? Well, you can find that out using the average true range indicator. Now here's how you can do it. First of all, identify the current ATR value and then multiply it by 2 or 3. So if the market moves 2 times the ATR value, then it could possibly be exhausted. Now, I don't suggest you trade this concept in isolation. Instead, combine it with support and resistances or other areas of values, and then there is a high chance that you'll find yourself identifying market reversals ahead of anyone else. For example, if you look at the weekly ATR value and it shows you 300 points, what it's telling you based on the previous period's data is that the market tends to move about 300 points over the last few weeks. And if in this week the market has moved, let's say 500 or 600 points, it's telling you that the price has already exhausted its ATR value. Think of it like energy being used and the market is exhausted. So if you see a market that has exceeded its ATR value by 2 or 3 times, then there's a high possibility that the market could show signs of reversals. So if the weekly time frame has about 300 points on its weekly ATR and the market has already declined more than 500 points lower, then I'm not asking you to go long suddenly in the anticipation of a bullish reversal, because the market could even stay in a range for a while. But think of this as a signal to alert you that this market has already moved more than 500 points in comparison to its weekly ATR value, which was only about 300 points. Now you have to look for evidence that supports your analysis of the possibility of the market actually reversing back higher. So you can look for potential area of values like support levels, dynamic supports like moving averages, where potential buying pressure could step in. You can also take the help of bullish reversal candlesticks like bullish engulfing patterns, rejection pin bars like hammers, etc. Or you can use a combination of both these setups to support your analysis. Now this should give you a hint that you don't want to be shorting in the market anymore, and if you are in a short position, you might want to exit out of the trade by booking profits or losses, whatever. Then you can get onto a long position in the anticipation that the market is about to reverse higher. Now this is how you can use the ATR indicator by basically looking at how much the market has exceeded its actual ATR value. You can use this method even in lower time frames, but as always, it works best with higher time periods.
I'm going to talk about how to analyze an option chain properly. Even if you are someone who is new to the world of options trading, or if you are having difficulty in understanding many concepts associated with options, or even if you are confused for that matter, don't worry, because this video will clear most of your doubts and queries. Understanding how to analyze and interpret an option chain data can help you better your chances when it comes to identifying trade opportunities, and also to take only convincing trades that have a higher probability of success. So with that idea in mind, this video will cover the following topics. First, we will look at a typical option chain, understand every important section of it, and learn about the important jargons and how they are being represented within an option chain. Then, we will have a detailed discussion about open interest and change in open interest. We will learn how to interpret and use the open interest data to read the market in a precise manner. You can get the option chain from different sources. You can get it from the NSI website, or you can access them from Opstra or Sensible. But let me make use of the option chain from NSI website for this video. Before going any further, let me clarify some basic concepts associated with options trading. I hope you are aware of what the concept of option contract is. Now, the contract is also called as a derivative just because the contract itself has no value. It derives its value from an underlying, which may be a stock or an index. For example, a Reliance option contract gets its value from the underlying Reliance stock. So any change in the value of the stock is associated with a change in the options contract. So in the option chain, you have the option to select the desired underlying. It can be a particular stock or an index. Now in the indices section, there are 4 available options to choose from, of which only Nifty and Bank Nifty have the ample liquidity. Next, you will get the option to select the expiry date. Similar to a food product that has an expiry date, which is the last day till which it can be consumed safely and after which it has to be scrapped. Similarly, an option contract has a far month, near month, and current month expiry. Here you can see 3 different option contracts which expire on 3 different months, and all of them expire on the last Thursday of every month. Now when it comes to index options, there are weekly expiries also available along with the monthly expiries.
Same with monthly expiries, the weekly contracts also expire every Thursday. So different expiries come with different premiums and totally different expectations about the market. Now the next component is the strike price. In order to understand the strike price, let us shed some light on spot price first. The spot price is the current market price of the underlying, which is considered as a reference while selecting a particular strike price. For example, Reliance stock is trading at the current market price of 2,400 rupees in the spot market. This is the spot price or the underlying price for Reliance. You can see the spot price just below the contract symbol in the option chain. Now, on the other hand, the strike price is an anchor price or the price that you expect Reliance to be trading at the end of the day or at the end of an expiry, and at which both option buyer and option seller enter into an agreement. It is like a reference point for many other calculations like the break-even point, intrinsic value of option, etc. So there are a lot of strike prices available to choose from, and we will get to that in a moment. Now coming to the main portion of an option chain, you can see that there are two sections. The left side is the call section and the right side is the put section. Now let us briefly understand what they imply. Call options gives the buyer of an option the opportunity to benefit from increasing prices of stock or an index. So when you have a bullish sentiment in the market and you expect the prices to move higher, then you can buy a call option contract. On the other hand, if you expect the market to move lower or expect the prices to fall, then you can think of selling a call option. Now, when it comes to a put option, you buy a put option when your sentiment is bearish and you expect the market to crash lower. On the other hand, you sell a put option when you have a fairly bullish or neutral view of the market. If we look closely, we can observe colored or highlighted sections and plain sections in an option chain. To understand this, we need to learn about the moneyness of options. Now, moneyness of option is a classification method that classifies each option strike based on how much money a trader is likely to make if he were to exercise his option contract today. Now, there are three broad classifications: in the money options, at the money options, and out of the money options. But for practical purposes, we can expand this classification to include two more types of options, that is, deep in the money and deep out of the money options. Let us make a note of each one. A call option is said to be in the money if the strike price is less than the current spot price of the security. For instance, Reliance is now trading at 2,390 rupees. Then the option strikes like 2,360 and 2,340, etc., which are lesser than the spot price, are said to be in the money strikes. On the other hand, a put option is said to be in the money if the strike price is more than the current spot price of the security. For instance, Reliance is now trading at 2,390 rupees. Then the option strikes like 2,420, 2,440, etc., which are greater than the spot price, are said to be in the money strikes. Now, the in the money strikes are usually highlighted. In this particular option chain, the in the money strikes are indicated in yellow. A call option is said to be at the money if the strike price is almost equal to the current spot price of the security. So, for instance, the Reliance is now trading at 2,395. Then the option strike of 2,400, which is very close to the spot price, is said to be an at the money strike. Similar is the case for put options. A put option is said to be at the money if the strike price is almost equal to the current spot price of the security. The ATM strikes are usually represented at the center of the option chain, but the strike changes as and when the underlying price or the spot price changes. A call option is said to be out of the money if the strike price is more than the current spot price of the security. For instance, Reliance is now trading at 2,390 rupees. Then the option strikes like 2,420, 2,460, etc., which are higher than the spot price, are said to be OTM strikes. A put option is said to be out of the money if the strike price is less than the current spot price of the security. For example, Reliance, which is trading at 2,390 rupees, the option strikes like 2,360, 2,340, etc., which are lesser than the spot price, are said to be out of the money strikes. The out of the money strikes are not highlighted and are represented in plain or white colors. Now, what are deep ITM and deep OTM strikes? The strikes which are too far away from ATM options are called as deep ITM and deep OTM strikes. Most often these strikes are illiquid and are less often traded. Moving on, beside the strike price, we can see bid and ask quantity and bid and ask prices. Now, bid and ask are market terms which represents demand and supply for a particular stock. The bid price represents the highest price that someone is willing to pay for a share. The ask price, however, is the lowest price where someone is willing to sell a share. Now, the difference between the bid and ask is called as a spread. Now, the bid size represents the quantity of a security that the investors are willing to purchase at a specified bid price. In a similar manner, the ask quantity represents the total number of sellers in a particular strike who are willing to sell at the specified ask price. So, in short, the bid and ask data helps you visualize the available prices and quantities for a particular strike. Now, beside the bid and ask are the LTP or the last traded price and the changes in LTP. So, LTP is actually the premium of the option at a specified strike price, and the change in LTP is the percentage change in premium compared to the previous day's closing price. Now, this helps to decide if the options are priced cheap or expensive. Now, there are several factors that decides the option pricing, but LTP can give you a bird's eye view. We will talk about option pricing in a different video, but for this video, let us limit our discussion to option chain. The next element is volume, which you may all be familiar with. So, in simple words, volume refers to the number of contracts that are traded in a given period of time. I have already made a video on market volumes from a price action perspective. So, if you want, you can check that out. The next component is IV or the implied volatility, which itself is a broad topic. So, we will discuss it in an upcoming video. Right. The final two elements are open interest and change in open interest. Now, open interest denotes the number of contracts that are active or which are not settled. Now, both volume and open interest are two key technical metrics that helps describe the liquidity and activity of options and future contracts. In terms of options, we are more interested in analyzing the open interest because it is of great use to us. But before all that, let me tell you with whose point of view you should look at an option chain. To be frank, writers or sellers of options are more important, and we should view the option data from the perspective of a seller. Now, there are many reasons for this statement. First of all, it takes conviction to sell, as there is unlimited risk associated with selling options, and therefore more money is required. Secondly, sellers are usually someone with bulk amounts of money like big institutions or smart money, and option buyers are usually the retail traders, as it is convenient to do option buying with less capital. So, in short, going by the idea that institutions are usually right, we view data from the perspective of an institution. With that idea in mind, let us focus on open interest. The first question that has to be answered is, how does changes in option interest occurs? We all know how volume data is calculated, but the open interest calculation is a bit different but interesting to learn. If both participants in a trade are initiating a new position, the open interest will increase. And if both the participants are liquidating an already existing open position, then the open interest will decline. However, if one participant is initiating a trade while the other is liquidating or squaring off an old trade, then the open interest will remain unchanged. So let us understand this with an example. Let's say person A and person B are trading the same option contract. So if A buys one contract to enter a long trade, the open interest increases by 1. Now the person B also goes long and buys 6 contracts, thereby increasing the open interest to 7. Now if another person C decides to short the market and sell 3 option contracts, then the open interest again increases to 10. The open interest would remain at 10 until the traders exit their positions, at which point the open interest declines. For example, the open interest declines to 9 when person A sells his 1 contract. Now when the person C decides to exit his position, he buys back his 3 contracts and brings the open interest down to 6. At this point, until the person B decides to sell her 6 contracts, the open interest will remain constant at 6. So even though open interest and volume are related concepts, one key difference is that volume counts all the contracts that have been traded, while open interest is the total of all the contracts that remain open in the market. Now keep in mind that we are talking about the number of contracts and not the number of shares. Now I want to talk about a common misconception about open interest. I've seen many people make this assumption that when prices are rising, they assume that more long positions are being created than short positions. But the fact is that the longs will always be equal to the shorts. But it is just that the longs are dominating the shorts in the transaction, and that is the reason why the prices are rising. Now you may ask me, if the number of shares bought is always equal to the number of shares sold, then how does the price rises or fall? Now the simple answer is buying pressure or selling pressure. So if buyers of a contract are dominating the sellers and they are willing to buy at higher prices, the prices will eventually rise. And if the sellers are dominating the buyers by selling at even lower prices, the prices will fall as a result. But buyers will always be equal to the sellers, because for a transaction to happen, there is always a seller for every buyer. So if the open interest is rising, it means new contracts are being added. But since the prices are rising with it, it means that the longs are dominating the shorts in the transaction. If the open interest is rising but the prices are falling, this means that more contracts are being added, but this time the shorts are dominating the longs in the transaction. Now with that cleared, let me talk about the uses of open interest data. Now there are a few uses of open interest data that you should be aware of. The first one is that it helps to identify the potential supports and resistance levels in the market. Further, it also helps to determine the direction of a trend and the sentiment of the market. Now let us first discuss on how to identify the support and resistance levels using open interest data. So in the option chain, you have to find the column on both sides which are having the highest open interest. That is on the call side and put side, you have to find the column with the highest open interest. Then you have to note the corresponding change in open interest also. Now, on the put side, the strike which has the highest open interest number and also having a positive change in open interest can act as a support level. This is because we assume that the put contracts are being sold by the big institutions with the view that the price will not fall below a specific price level or strike price. And most often, these institutions are right, and there is a high chance that the strike level will not be crossed. And a positive change in OI implies that put writers are selling extensively because they feel that the strong will not fall below the respective strike level. Now, on the contrary, if there would have been a negative change in OI, it implies that the put writers are squaring off their positions because they feel that the stock will fall below the respective strike level. Now when it comes to the call side, the strike which has the biggest open interest number and a positive change in open interest can act as a resistance level. Similar to the previous case, here also we will assume that the open interest is created by the sellers of the call option and they have the view that the price will not move above a particular strike level which will resist the prices. Now most often they are right and there is a high probability that the level will not be crossed. On top of that, a positive change in open interest implies that the call writers are selling extensively because they feel that the stock will not rise above the respective resistance level. Now, on the opposite, if there would have been a negative change in OI, it would imply that the call writers are squaring up their open positions because they feel that the stock will rise above the respective strike level. Now, it is easier to visualize the support and resistances using open interest with the option chain provided by Sensible rather than the NSE side, because in NSE website you have to crunch the numbers more to come to a conclusion about the resistance and support levels, but with Sensible you can visually see the probable resistance and support level as they are highlighted properly with suitable colors, so you can make use of it if you want. Now we will study what a particular strike price is showing us. A strike price can reveal any of the following. It can be a long build-up, a long unwinding or long liquidation, a short build-up or short covering. Now let us understand what each of this means. If the price is rising and the open interest is also rising, this signals a long build-up. Now, if the price and OI are both rising, it means that new contracts are being added which are dominated by the longs, and that is why the price is rising with every new contract addition. A long build-up on a call option depicts that market participants are ready for bullish action on the index or instrument, whereas a long build-up on a put side depicts that the market participants are ready for bearish action on the index or instrument. So for the call side, the long build-up is viewed as a positive event, while for a put side, it is viewed as a negative event. In the second case, the price is falling and the open interest is falling. It means that the fall in price is due to long liquidation. It is also called as long unwinding. Now notice why the open interest is falling. The reason why the open interest is falling is that the positions are being squared off and the number of open contracts in the market is reducing. But since the price is falling with it, it means that either the long positions are being squared off or new short positions are dominating the transaction. Now think about it. How will long positions be squared off? The simple answer, they will square off by selling. And this is exactly why the prices are falling in this case. Now the prices are not falling because of the new short positions that are being created. The reason being, the open interest is also falling. So the real reason for the price fall is because the longs are squaring off their positions. It can be a trap for the unaware traders, and they can be led into thinking that new short positions are being created, but this is not true. Now the long liquidation or unwinding on call options depicts that the market participants are losing hope in the bullish action of an index or instrument, and this may signify a start of a bearish trend, whereas a long unwinding on the put side depicts that the market participants who were bearish on the instrument or index are now witnessing a loss of steam on the bear side, and this may be considered as an inception of a new bullish trend. So for the call side, long unwinding is viewed as a negative event, while for the put side, it is a positive event. Now in the third case, if the prices are falling, but the open interest is rising, this is called as a short buildup. So if the prices are falling and the open interest is rising, it straight away means that the shorts are dominating the longs. Since the open interest is rising, it means that new contracts are being added. But since the price is also falling, it means that the new contracts which are being added are dominated by shorts and not the longs. So a short buildup on call side depicts that the market participants are writing the calls on a particular strike price, which would act as an immediate resistance when moving ahead. Whereas a short buildup on the put side depicts that the market participants are writing puts on a particular strike price, which would act as an immediate support level for the current scenario. So for the call side, the short buildup is viewed as a negative event, while for the put side, it is viewed as a positive event. Lastly, if the price is rising, but the open interest is falling, this is called as short covering. Now, if the price is rising, but the open interest is falling, it means that the rise in the price is due to short covering and not new long positions being created. Now, notice why the open interest is falling. it is falling because existing positions are being squared off and the number of open contracts in the markets are reducing. But since the price is rising with it, it means that the short positions are squaring off in the transaction. Now, how will short positions be squared off? Simple answer, they will square off by buying. Now that explains why the prices are rising. So the price is not rising because the longs are dominating or new long positions are being created. Instead, it is rising because the short positions are dominating the squaring off process. So it can act as a trap for those unaware traders who can be led into believing that new long positions are being created, but this is not true. Now, short covering on the call side can signify that the writers are squaring off their positions and they are considering it as a weakening of resistance, which is actually a good sign for the index or instrument to expect a breakout, whereas short covering on puts signifies that the writers are leaving their positions and considering a weakening of support, which is actually a bad sign for the index or instrument. So for the call side, short covering is a positive event, while for the put side, this is a negative event. Now, we have already discussed in the previous section how the relationship between price and open interest gives us an idea about the sentiment of the market. Now, let us identify the market direction using this concept for call and put options. Now, let us study the call option interest first. So, a rise in the call option price along with a rise in the open interest will indicate that there is a long call buildup, which is a bullish sentiment. Similarly, a fall in the call option price but with a rise in the open interest can indicate a short buildup in the call side, which in turn indicates a bearish sentiment. Now, if there is a rise in the call option prices but a fall in the open interest can be observed, it indicates that there is call unwinding or short covering that is happening. And finally, a fall in the call option prices along with the fall in the open interest indicates a long liquidation or long unwinding in the calls. Now let us discuss the same with put side. A rise in put option price along with a rise in the open interest will indicate a long buildup in the put side, which in turn indicates a bearish sentiment. Further, a fall in the put option price but with a rise in the open interest indicates short buildup in the put side, which further indicates bullishness. The third scenario is where there is a rise in the put option prices but with a fall in the open interest. This is a result of put unwinding or long liquidation on the put side. And finally, a fall in the put option price along with a fall in the open interest, it will indicate a short covering or the possible start of the put buying. Now let us combine both calls and puts and try to make a relation out of them. So if a call option writer is adding the position or increasing the positions and a put option writer is exiting their positions or decreasing their positions, this indicates a bearish sentiment. Now, if a put option buyer is adding more positions or increasing their positions and the call option buyers are exiting their positions or squaring off or decreasing their positions, this also signals a bearish sentiment. Now, if a call option writer is exiting his positions, but the put option writers are adding more positions, then this is a bullish sentiment. Finally, if the call option buyers are increasing or adding their positions, and the put buyers are decreasing or exiting their positions, this also indicates bullish sentiment. So these are the important relations that you need to be aware of when you are looking at an option chain. So in Sensible's option chain, you can see other elements like delta, vega, gamma, theta, etc., which are called as option Greeks, which by itself is an extensive topic for discussion. So I'll make a separate video or videos on each of them so that you can improve your option chain analysis skill to master the world of option trading. So make sure you practice reading the open interest data and option chain as a whole so that you will get a knack of how to analyze and interpret the data that has been provided in the option chain.
Why you should learn or understand the intricacies of options pricing. Anyhow, it's not going to make you any money. But I suggest you think again, because a renowned trader and hedge fund manager Edward Othorpe would not agree with you. If you know Ed Thorpe, then you know he is a real deal.
This partial differential equation that you see on the screen was the game changer. Using a similar option pricing model and some other mathematical models and probability theory, Ed Thorpe managed a hedge fund called Princeton Newport Partners. Instead of publishing it, he kept his findings a secret, and he used this formula to achieve substantial financial success for himself and his investors. This went on until 1973, when Black, Scholes, and Merton published their work for the public. The hedge fund managed by Ed Thorpe, which operated from 1969 to 1988, reportedly generated an annualized return of around 15 to 20%, which was substantially higher than the broader market performance for that period. It is actually a very interesting story, and you can watch the detailed video on the Veritasium channel. Anyways, in this episode, I will not go into the history of option pricing or its significance. Instead, I will try to help you understand how options are priced by breaking down this complex looking Black-Scholes equation into 7 components or factors that drive the option pricing. In essence, I will help you understand things like why Nifty 24,000 put option is trading at 100 rupees and not at 50 or 150 rupees. This will help you accurately assess the value and the potential risk of options. It will also help avoid unnecessary losses, optimize the timing of your trades, and also make more informed decisions as to when to buy, sell, or hedge options. We will begin by discussing the main elements forming an options price. We have learned in our previous episode that option price, which is also known as the option premium, is the price that an option buyer must pay to the option seller to acquire the right to exercise the option agreement. But did you know there are actually 2 elements to an option price? There is an intrinsic value and there is a time value. In other words, option price is the sum total of intrinsic value and time value. Let us now understand what each of these elements mean. Let's begin with the intrinsic value of an option. I hope you already have a fair idea about what intrinsic value is. But for the sake of context, let's brush up our memory once more. Basically, intrinsic value of an option measures the extent to which an option is in the money or ITM. In its raw form, IV can be calculated by finding the difference between the strike price of an option and the corresponding spot price of the underlying. At any point in time, the intrinsic value of an option could be either positive or 0. It can never be a negative value. A positive intrinsic value occurs when the holder of the option contract stands to benefit by exercising his right to the option, while a 0 intrinsic value occurs when the holder of the option contract would not benefit by exercising his right to the option. For instance, if the strike price of a call option is 100 rupees and the prevailing spot price of the corresponding underlying is 120 rupees, the call option would have a positive intrinsic value because the call buyer can benefit by exercising his right to buy the underlying upon expiry at 100 rupees and then sell it in the market for 120 rupees, thereby making a profit of 20 rupees, which is nothing but the intrinsic value. On the other hand, if the strike price of a put option is 100 rupees and the prevailing spot price of the corresponding underlying is 120 rupees, the put option would have no intrinsic value because the put buyer would not benefit by exercising his right to the option and he would rather be better off by selling the underlying at the prevailing market price. We have also talked about the formula to find the intrinsic value of call and put options upon expiry. In the raw form, intrinsic value of a call option is the difference between the spot price and the strike price. I have also provided the polished formula for the same. So a call option will have a positive intrinsic value when the strike price is below the current market price. On the other hand, a call option will have no intrinsic value or 0 intrinsic value when its strike price is equal to or above the spot price. So if this value is positive, it means the call option has an intrinsic value. If it is 0 or negative, it means the call option has no intrinsic value. Likewise, the difference between the strike price and the spot price upon expiry gives the intrinsic value of a put option.
So, a put option will have a positive intrinsic value when its strike price is above the current market price. On the other hand, a put option will have no intrinsic value when its strike price is equal to or below the current market price. So, if this value is positive, it means the put option has an intrinsic value, and if this value is 0 or negative, it means that the put option has no intrinsic value. So, always keep in mind that intrinsic value cannot be negative. As such, if the intrinsic value of a call or a put option turns out to be negative, as given by the basic rho IV formula, then it is to be considered as 0. Now, the next element in the option pricing is time value. While intrinsic value is the tangible portion of the option price, time value is the intangible portion of the option price. It is also known as the extrinsic value of an option. The time value of an option is determined not by the price of the underlying, but rather by the time to expiration of the option. So the greater the time to expiration, the greater would be the time value of an option and vice versa. And as the time to expiration reduces, so does the time value. And upon expiration, the time value of an option would become 0. This might be a new concept for you, so let us consider a real life example. Let's say you have taken a transparent glass and you pour beer into it. You know beer, right? The alcoholic beverage with bubbles. So when you pour beer into the glass, two layers are formed. There is a liquid layer at the bottom with actual beer in it, and to the top of it is a frothy foam layer with bubbles. You fill the entire glass. Now, the entire quantity of liquid layer and foam layer forms the option price or premium at the start of the contract. The foam layer is considered as the time value, while the liquid layer represents the intrinsic value of the option. You know what happens to the foam layer in the glass as time passes. The foam layer settles slowly, and after a while the foam layer vanishes completely, leaving behind only the beer layer. This is exactly what happens to the time value of options. As the option moves closer to the expiry, the time value reduces, and upon expiration, the time value completely vanishes or becomes 0, leaving behind only the beer, or is just the intrinsic value of the option. In some cases, the glass is completely filled with foam only. So as time passes, there will be nothing left in the glass. Just like this, some options will only have time value as its premium, and during expiration, the time value becomes 0, and that option would not have any real value or intrinsic value, meaning that the option would expire worthless. I hope the example made it easy for you to understand. Now, the real reason why time value gradually erodes is because of a concept called time decay. We will talk about this when we discuss about option Greeks. Anyways, the greater the time to expiration, the higher is the probability of the option price moving in favor of the option buyer, and the vice versa is also true. So as time to expiration reduces, so does the probability of an option price moving in favor of the option buyer. So time value of an option could also be thought of as a part of option price that an option writer receives for taking the time risk. We have already talked about this in one of our previous episodes, if you remember. As you know by now, the price or premium of an option is readily available on the option chain, while the intrinsic value of an option has to be calculated by finding the difference between the strike price and the spot price of the underlying. The value that is left over in the option price equation that was mentioned earlier is actually the time value of the option. Let's take an example to clear things up. Let us assume that the strike price of a call option is 100 rupees. The current price of the underlying is 120 rupees and the option premium is 25 rupees. The intrinsic value of this call option is 20. Now that we know the option price and the intrinsic value, the time value of the call option can be calculated as 5 rupees. This 5 rupees is the excess premium that a seller would make for taking the time risk. On the other hand, what if the strike price of an option is 100 rupees, the current price of the underlying is 90 rupees, and the option premium is 5 rupees? In this case, the intrinsic value would be 0 because negative intrinsic values are considered as 0. As such, the entire option price of 5 rupees would reflect the time value of the option. In other words, this option would only have time value and no real value or intrinsic value. So an important thing to make out of this is that for options whose intrinsic value is 0, the entire option premium reflects the time value of the option. Now that you have a good understanding about the pricing of options, it is time to move on to the most important part of this video. We are going to deal with the factors that impact the price of an option. In the previous episodes, we have defined an option as a derivative contract that gives the holder or buyer of the instrument the right but not the obligation to buy or sell an underlying asset at a certain fixed price on a predetermined expiry date. From this definition itself, we can spot a few factors that impact the option price. These factors are the right to buy or sell, which is nothing but the type of option contract, the underlying asset, which includes the market price of that asset, a fixed price, which is nothing but the strike price, and a predetermined date, which is nothing but the expiry date. Besides all these factors, option price is also strongly influenced by volatility, which is a measure that is not tangible unlike the above 4 elements, but rather it must be estimated. In addition to this, option price is also impacted by interest rates, and in case if the underlying is a stock, it is also impacted by dividends. So the factors that impact the price of an option are the following. So it includes the type of option, the underlying price, the strike price, time to expiration, volatility, interest rates, and finally dividends in case the underlying asset is a stock. Let us now understand in detail how each of these factors impact the price of an option. Let's start with the type of option under consideration. Whether the option is a call option or a put option will have a noticeable impact on its price. For instance, in case of a call option, the option price will rise when the underlying price goes up and it falls when the underlying price declines. On the other hand, in the case of a put option, the option price will fall when the price of the underlying goes up and rises when the price of the underlying goes down. So if a trader is long a call option or short a put option, he will benefit during times when the underlying price is rising and vice versa. Similarly, if trader is long a put option or short a call option, he will benefit when the underlying price is declining and vice versa. Look at this 15 minutes chart that compares the intraday movement in Nifty index with a corresponding movement in Nifty 24,900 call option. You can observe in the chart that as the price of the Nifty index increased, so did the price of the Nifty 24,900 CE. Also notice the minor down move in the option price whenever Nifty declines. Meanwhile, if you take a look at this 15-minute chart that compares the intraday movements in Nifty index with corresponding movements in 24,800 put option, you will notice that as the price of Nifty dropped, the price of the Nifty 24,800 PE went higher. You can also observe that the intermittent recoveries in Nifty were accompanied by a noticeable decline in the option price. From these examples, we can see that the type of an option, whether it is a call or a put option, strongly influences how the price of the option moves. Now, for each of the factors that are to be mentioned next, the impact of the option price is affected by whether the option is a call or a put. So with that in mind, let us look at the next factor, which is the underlying price or spot price. As you may know by now, option price is impacted by the price of the underlying asset. The price of the underlying asset is a variable, as it keeps fluctuating over the life of the option contract. An increase in the price of the underlying benefits the holder of a call option in case the underlying price moves above the strike price or even above the break-even price of the option and vice versa. Alternatively, a decrease in the price of the underlying benefits the holder of a put option in case the underlying price moves below the strike price or maybe even below the break-even price of the option and vice versa. In other words, the value of a call option will increase and that of a put option will decrease as the underlying price increases and moves above the strike price or break-even price, while the value of a put option will increase and that of a call option will decrease as the underlying price decreases or move below the strike price or break-even price. We can consider the example of Nifty index and Nifty options provided earlier. So as the price of the underlying changes, so does the price of the option. The two charts shows that as the underlying price moves up, the value of a call option increases while that of a put option decreases. The opposite is also true as the underlying moves down. Therefore, the underlying price has a strong influence on the price of an option. Next up is strike price. While the underlying price is a variable price, the strike price on the other hand is a fixed price. It remains constant throughout the life of the option contract. By now, you may be aware that the moneyness of an option can be measured by looking at the difference between the strike price and the underlying spot price. We know that if the strike price is below the underlying price, the corresponding call option is in the money and the corresponding put option is out of the money. On the other hand, if the strike price is above the underlying price, the corresponding call option and put option are out of the money and in the money respectively. Hence, the position of the strike price relative to the underlying price has an impact on the price of an option because it directly impacts the intrinsic value of an option, which, as we have already discussed, is a key component of the option price. The lower the strike price is below the underlying price, the higher will be the price of the call option and the lower will be the price of the put option. Similarly, the higher the strike price is above the underlying price, the higher will be the price of a put option and the lower will be the price of a call option. Take a look at this option chain data for Nifty options. The prevailing spot price of Nifty is around 24,820. Just focus on only two things: the strike prices, which are located at the exact center of the table, and the last traded price or LTP for both call options and put options. As we already know, the rows that are highlighted in yellow indicates options that are in the money, while the ones that are in white indicates options that are out of the money. In this case, the at the money strike is 24,800. You can observe that in case of call options, the lower the strikes relative to the underlying price, the higher is the option price or LTP and vice versa. For instance, it can be seen from the table that a call option with a strike price of 24,500 is much more expensive than a call option with a strike price of 25,000. Similarly, in case of put options, the higher the strikes relative to the underlying price, the higher is the option price or LTP and vice versa. For instance, it can be seen from the table that a put option with a strike price of 25,000 is much more expensive than a put option with a strike price of 24,500. I hope the effect of strike price is understood. Moving on, the next influential factor is time to expiration. While the strike price has an impact on the intrinsic value of an option, the time to expiration has an impact on the time value of an option. So the greater the time to expiration, the higher will be the probability of the option moving in favor of the buyer or ending up in the money. This means the higher will be the time value of an option and subsequently the higher will be the option price or premium. Similarly, the lower the time to expiration, the lower will be the time value of an option and subsequently the lower will be the option price or premium. A crucial thing that we have discussed earlier is that as time passes by, the time value component of the option price will decay at an exponential pace. During the initial life of an option contract, the pace of time decay will be slow. However, as the time to expiration reduces or comes closer, the pace of time decay will start accelerating. During the later stages of an options contract, the pace of time decay will be very fast. At the expiry, the time value of an option will fall to zero. We will understand this better when we take up the concept of option Greeks. But for giving you a primary idea, take a look at this chart. In this chart, you can notice the speed of decay in time value.
In the initial days, the pace of time decay was slow, but as the time passes by, the pace of time decay started accelerating. You can notice how the speed of time decay increased massively from 30 days left to expiration till the expiration date. So a key thing to remember is that time decay works in favor of an option seller and it works against the option buyer. So understanding the concept of time decay is a very crucial part of learning options. And as stated before, we will talk about this in much greater detail when we take up option Greeks. For now, just keep in mind that option price is strongly influenced by the time value component. From now on, we are entering a territory which we have not yet touched. I'm going to talk about the next factor, which is volatility, which is one of the most important factors to consider when trading options, or at least when talking about trading as a whole. In simple layman terms, volatility is the rate at which the price of an asset fluctuates over time. It tells you nothing about the direction in which the price of the asset is moving. Instead, volatility just tells the magnitude of fluctuation in the price of the asset. A very commonly used measure of volatility is standard deviation, which by the way measures the amount of dispersion or deviation around a mean or average value. Beta is another commonly used measure of volatility, especially in the stock market context. The reason why volatility is such a big deal or such a vital concept in finance is because it helps to measure the risk involved in an investment. I have talked about this in some of my other videos, that the greater the volatility, the greater is the risk involved in the investment and vice versa. And the greater the risk involved in an investment, the greater is the potential return that an investor can expect for that excess risk. As far as options are concerned, there are two types of volatility. These are historical volatility and implied volatility. As the name suggests, historical volatility is based on past fluctuations in the price of the underlying asset over a specific period of time, usually for a period of 1 year. On the other hand, implied volatility is used to measure the future volatility. Unlike historical volatility, which is based on past data, implied volatility is based on what market participants imply the volatility of the underlying to be in the future. Given that implied volatility is forward-looking, it is widely used in the pricing of options. Generally, implied volatility is expressed as a percentage on an annualized basis. If you look at the option chain on both the call and put side, you see a term named IV. Don't confuse this with intrinsic value. Instead, this represents the implied volatility. We will talk extensively about the volatility concept in a few of our upcoming episodes. Meanwhile, let's briefly talk about some of the important concepts. For your kind information, implied volatility is reflected in the time value component of an option. In other words, time value of an option is impacted not just by the time to expiration, but also by the implied volatility. This means higher the implied volatility, higher would be the time value component of an option, and subsequently, the higher would be the option price and vice versa. Implied volatility is a metric often used by market participants to determine whether a trade is worth taking or not. For instance, traders often compare the current implied volatility of an option with the average implied volatility of the past n periods to see whether the option is cheap or undervalued, or is it expensive or overvalued, and then make a decision. Given the fact that volatility tends to revert to the mean value, traders, especially with a greater risk appetite, often use higher than average IVs, which is indicative of overvalued options, to sell these options, expecting to profit from the volatility returning to the normal levels later. Similarly, there are traders who often use lower than average IVs, which is indicative of undervalued options, to buy these options, again expecting to profit from the volatility returning to normal levels. I know most of you have no idea of what I'm talking about, but the thing is that volatility in itself is a very huge topic of discussion. Given the significant impact it has on the price of an option, it would be discussed in much greater detail later.
For the time being, just keep in mind that higher the volatility, higher would be the price of an option, and the lower the volatility, the lower would be the price of an option. Now, for the calculations, you can use the implied volatility provided in the option chain. Now, if you scroll all the way down, in the notes section, you can see a remark stating that the implied volatility is displayed for reference purposes only. It is computed at a fixed time intervals using various parameters such as last traded price, underlying values, etc. Hence, it is dynamic in nature. What it means is that IV changes on a minute-to-minute basis. Moving on, the next factor is interest rate. Interest rate or risk-free rate also affect the price of an option, although not as much as each of the variables that we have already talked about does. The reason why this is the case is because interest rates don't tend to move as frequently and as much as the other variables such as the underlying price, time to expiration and volatility tend to move over the life of an option contract. Even with that being said, as the interest rate has an impact on option price, it is worth understanding how interest rates impact option prices. So, a rise in interest rates benefits the value of a call option, but it would affect the value of a put option. The reason why this happens is because as interest rates go up, the opportunity cost of investing in a certain financial instrument, such as stock, also goes up. Why does this happen? This happens because a rise in interest rates make the interest-bearing instruments such as fixed deposits, government bills, and T-bills more attractive. At the same time, it makes buying shares on borrowed money more expensive because the cost of borrowing also goes up as banks will now charge a higher interest on borrowings. Due to this reason, buying call options on stocks rather than buying stocks outright on borrowed money becomes more attractive, given that the cash requirement on buying options is much lower because of the greater leverage that options provide. Therefore, the value of call options tends to go up because of a potential rise in the demand for them. Buying a put option on the stock, on the other hand, would lead to a cash outflow from the trading account because you need to pay the total cost of the option when you are buying. For put options, an increase in the interest rates usually results in a decrease in their prices. This occurs because the present value of the strike price, which will be paid when the option price is exercised at a future date, is worth less when discounted back at a higher interest rate. This makes the put option less valuable, as the benefit of holding the option or the right to sell at a predetermined price is reduced when the money today is expected to be worth more than the same amount in the future due to a higher interest rate. Therefore, the value of put options tends to go down because of a potential decline in the demand for them. Hence, rising interest rates benefits call options and hurt put options. The opposite is also true when interest rates go down. Now, where to find the interest rate applicable? For this, you need to scroll all the way down to the bottom of the NSE option chain. In the notes section, it says 10% interest rate is applied while computing the implied volatility. You can consider this rate for calculations. Of the factors impacting option price that we have studied so far, interest rates are arguably the least important factor in terms of how much they impact the option price. Other factors such as underlying price, strike price, time to expiration, and volatility are much more important inputs in valuing an option than interest rate is. For now, remember that rising interest rates benefit call options and it hurts put options, while falling interest rate benefits put options and it hurts call options. Now, the final factor that impacts the price of an option is the dividend. As mentioned earlier, this factor is only applicable to stock options and not to any other type of options. In fact, this factor applies to only those stocks that are expected to pay a dividend during the life of an option contract, which is usually 90 days. An important thing to remember here is that when options are priced, it is assumed that they would be exercised only on the expiration date. Also, at the time of pricing options, the dividend that a company would potentially give on the stock up to the expiration date of an option contract is taken into consideration. But You might have this doubt as to how exactly does dividend impact the price of an option. Well, for a fact, on the ex-dividend date, which is actually the cutoff day for determining which shareholders are eligible to receive the dividend declared, assuming everything else is constant, the price of the stock reduces by as much as the amount of dividend that is payable by the company to its shareholders. Given that the price of the stock drops on the ex-dividend date to account for the dividend payable, the price of a call would gradually drop, while the price of a put would gradually rise to reflect this drop in value of the stock. In other words, if the company is projected to give a dividend during the life of the option contract, the price of a call option would be cheaper or undervalued, while the price of a put option would be expensive or overvalued, assuming all other things are constant. Hence, the higher the dividend, the lower would be the price of a call option, and the higher would be the price of a put option. Just like the interest rate component of option pricing, the dividend component does not have much of an impact on the price of an option, unless the dividend amount is substantially large. This is because any potential dividend that would be paid on a stock during the life of an option contract is gradually reflected into the price of an option well ahead of the ex-dividend date. Of the factors influencing option price that we have studied so far in this episode, dividend along with interest rate is arguably less relatively important compared to other factors. In fact, the type of option, underlying price, strike price, volatility, and time to expiration have a much more relevance on the price of an option. I have plotted a table which shows the impact of these 7 factors on both call and put options. You could take a screenshot for future reference if you want. In this table, direct impact means that a specific factor has a direct impact on the price of an option, while inverse means that a specific factor has an inverse impact on the price of an option. For example, the underlying price impacts the call option directly, meaning a rise in the underlying price leads to a rise in the price of the call option as well. Meanwhile, the strike price impacts a call option inversely, meaning the lower the strike price, the higher would be the value of a call option. I hope you get the logic. Now, last but not the least, let us look at the magical partial differential equation that has changed the derivative market for good. We will look at the partial differential equation first. In this partial differential equation, the term V represents the price of the option as a function of time and the spot price of the underlying. R denotes the risk-free interest rate. Sigma denotes the volatility of the underlying asset. S represents the spot price of the underlying asset. And T denotes the time to expiration. As you can notice, certain terms like strike price and dividend are not explicitly represented in this partial differential equation. However, strike price is a crucial term when applying boundary conditions and solving the equation to determine the option price. So I will represent Black-Scholes and Merton equation to determine the pricing of European styled options. So the equation for European call option is displayed on the screen here. And in this equation, C indicates the call option price at a time t. N of D1 and N of D2 represents the cumulative distribution function of the standard Norman distribution, whose expansion is also provided here. S represents the spot price of the underlying asset. X denotes the strike price of the option. R is the risk-free interest rate. Q is the continuous dividend yield applicable only to stock options. T is the time to maturity. And sigma denotes the volatility of the asset. On a similar note, you can also have the equation for pricing a European put option. You can see it for yourself. Now, these days, Black-Scholes and Merton calculators are freely available online, and I have attached a link to one of them in the description. You can plug in the values and see for yourselves. And do comment down if these results are in line with the premium amounts provided in the option chain.
The concept of strike selection is a highly discussed topic in options, but only a very few people actually know how to select a particular strike at a particular time of a particular option contract And moreover, you need to have a proper reasoning as to why you have selected that particular strike or strikes. In this video, we are going to do exactly that. I will help you encounter most of your fears when it comes to options trading. I will discuss the strike selection process from an option buyer's perspective. I won't be discussing the strike selection for an option seller because it is yet another vast topic of discussion. Maybe I will make another detailed video for that if this video gets at least 1500 likes. And make sure to watch this video till the end without skipping because there won't be any loose talks and each and every point is an important piece of information that might transform the way you trade options the next time. So with that being said, we will start our discussion of strike price selection for option buyers. I know most of you retail traders are option buyers, and the reasons for this is quite simple. First of all, it takes less capital to buy options rather than to sell them. You can buy a large number of lots for a comparatively lesser amount of money. Moreover, you get more value for your money if the trade goes in your favor. The returns that an option buyer can make is mind-blowing. Also, you don't need to be bothered about any peak margin penalty, or you don't have to deal with the complex looking Greeks like theta, gamma, delta, etc. And all you need to have is a directional bias. Then select the option you want to buy, be it a call option if you have a bullish view or a put option if you have a bearish view. Then select the strike price you want to trade. And if the price moves in the direction that you anticipated it to move, then you stand to make a lot of money. Now, these are all the good stuff when buying options. But if it was too easy, why do most option buyers fail terribly in the market? Why do 80% of them lose all their capital within a few days or weeks? Let me tell you why. The first and foremost reason is the lack of proper knowledge about the world of options. When you see someone making a killing out of the market, making lakhs and crores within days or weeks, you instantly get the fear of missing out and you step into the market with hard-earned money only to see it burn. The second reason is the lack of awareness of who your friend and enemy is. See, when you are an option buyer, momentum is your friend and premium decay due to theta is your enemy. The third reason is critical: strike price selection. Most low capital option buyers buy deep out of the money options just because it is cheap. And for sure, you are not going to make any money out of these OTM strikes. You need to realize that you trade options to make money rather than not to lose money. The fourth reason is associated with an inherent property of options. Options are decaying assets, meaning that the time value of option premium reduces with time and it is more evident when we get closer to the expiry. Now, one of the biggest reasons why most option buyers go broke is due to the lack of proper stop losses. Most of them try to average their losses instead of cutting their losses. Your stop loss will depend on the strike price that you have selected. So for an ATM and OTM options, the stop losses will be different. And the golden point that most traders, be it option buyers or option writers, miss out is that in options, you need to buy into volatility and sell into stability. See, when markets and stocks become volatile, options become more valuable as the premiums rises. In short, volatility means that the stock or the index can swing wildly in either direction. As an option buyer, even though your risk is limited to the premium paid, but on the upside, your returns can be boundless. So when volatility rises, it is the time to buy options and not to sell options. Now, I don't want to confuse you with a lot of volatility stuff, but keep in mind that when volatility is rising, you should be buying options, and when volatility is reducing, you should be selling options. It is when you play against these rules that you lose money in options. Now, I will make a detailed video on the volatility topic if you want. Please do mention in the comment section. Now, let's look into the strike selection process if you are into option buying. I'm hoping that you have a decent enough strategy, be it any reversal strategy or breakout strategy or volatility contraction and expansion strategy or mean reversion strategy or any other strategy where you expect the prices to move strongly or with momentum in your desired direction. Now you can ask me, why do you want prices to move with strong momentum? This is where we will look into the significance of delta, which is a very important option Greek for buyers. I will try to explain this concept as simply as I possibly can. Actually, delta is the change in the option's price or premium due to change in the underlying futures price or spot price. Delta is not an absolute measure, but instead it is a percentage measure. Think of it like the speed of a car. Similar to how fast or slow a car moves when its speed increases or decreases, the option premium increases or decreases with respect to changes in delta value. Similar to the speedometer of a car, where the speed is capped between 0 km per hour to some 150 or 220 km per hour, the delta values are also bound between 0 and 1 in case of call options and 0 and -1 in case of put options. Now you may ask why this difference. The explanation is quite simple. This is because a rise in the price of a stock or its futures is positive for call options, because when the stock or future price rises, call option premiums increases in value, while it is negative for put options because a rise in stock or futures price is associated with a decline in put option premiums. In fact, the negative sign is to show this difference and nothing else. So in short, call options have a positive delta. For example, a call option with a delta of 0.3 indicates that for every 1 point gain or loss in the underlying, the call option premium gains or losses 0.3 points. On the opposite, put options have a negative delta. So a put option with a delta of -0.4 indicates that for every 1 point gain or loss in the underlying, the put option premium gains or losses 0.4 points. Now, one thing that I want to point out is that option premium is not just related to delta only, but instead it is obtained as a result of taking many other factors into consideration, such as volatility, time to expiry, interest rates, dividends, etc. But for simplicity, we are going to continue using this assumption, and the difference between the actual value is quite negligible if your position sizing is not too large. Now, take a look at this graph. It shows the relationship between different option strikes and the delta for call and put options. From this graph, it is clear that the OTM options have a delta value between 0 and 0.5, ATM option has a delta of 0.5, and ITM options has a delta between 0.5 and 1 in case of call options. And for put options, OTM strikes have a delta between 0 and -0.5. ATM option has a delta of -0.5, and in the money option has a delta between -0.5 and -1. So what we can infer from this information is that as the option strike changes from OTM to ATM to ITM, the delta changes, therefore the premium changes, and the option start to mimic the underlying. Meaning that for every rupee change in the underlying value, the option premium will also change a rupee. Let's take a few examples to understand these concepts better. Let's say the Nifty spot price is 18,010, and so the at the money strike is 18,000. Now if you consider the 18,000 at the money call option, which is priced at 100 rupees and the delta value is close to 0.5. What this means is that for every 1 rupee change in Nifty spot price, the 18,000 call option premium will increase by 0.5. So if the spot price changes to 18,020, that is spot price increased by 10 points, then the call option premium will increase by 5 points to 105 rupees. And if Nifty falls to 18,000, that is spot price decreased by 10 points, then the 18,000 call option premium will drop 5 points to 95 rupees. Now what will happen to the delta value of 18,000 call option when Nifty spot price rises or falls by 100 points? That is, it becomes 18,100 or 17,900. Do you think the delta will still remain at 0.5? No, right? When the Nifty spot increases 100 points to 18,100, the 18,000 call option strike, which was ATM before, now becomes an in-the-money option. Since we know that the delta range of ITM options is between 0.5 and 1, and so in this scenario, the delta will vary between 0.6 and 0.7, which will in turn mean that the strike price premiums will increase faster than before. Now on the opposite, if the Nifty spot price were to fall 100 points to 17,900, then 18,000 call option strike, which was at the money before, will now become an out of the money strike. So naturally, the delta value will reduce from 0.5 and it will now range between 0.3 to 0.4, which in turn implies that the option premium will now move slower than before. Let's look at a similar example for put options to have a solid understanding of the concepts. Let's assume that the Nifty spot price is 18,010 and so the at the money strike is 18,000. Now if you consider the 18,000 at the money put option, which is priced at 110 rupees and the delta value is close to minus 0.5. This means for every 1 rupee change in the Nifty spot price, the 18,000 put option premium will change by minus 0.5, and for every 1 rupee drop in the spot price, the ATM put option premium will rise by 0.5 rupees. So if the spot price changes to 18,020, that is, the spot price increased by 10 points, then the put option premium will decrease 5 points to 105. And if Nifty moves to 18,000, that is, the spot price decreased by 10 points, then the 18,000 put option premium will rise 5 points to 115 rupees. Now what will happen to the delta value of 18,000 put option when the Nifty spot price rises or falls by 100 points? That is, it becomes 18,100 or 17,900. Do you think the delta will remain at minus 0.5? No, the delta will actually change. When the Nifty spot price increases 100 points to 18,100, the 18,000 put option strike, which was at the money before, will now become an out of the money option. Since the delta range of out of the money options is between 0 and minus 0.5, so in this scenario, the delta will vary between minus 0.3 or minus 0.4, which will in turn mean that the speed of the strike price premium changes will be slower than before. Now on the contrary, if the spot price were to fall 100 points to 17,900, then the 18,000 put option strike, which was at the money before, will now become an in the money strike. So naturally, the delta value will increase from minus 0.5 and it will range between minus 0.6 to minus 0.7, which in turn implies that the option premiums will now move faster than before. So let's summarize what we have learned so far. Number one, when the spot price of the asset changes, the moneyness of an option changes and therefore the delta also changes. Number two, since the delta changes with changes in spot prices, delta is actually a variable and not really a fixed entity. Therefore, if an option has a delta of 0.5, this value is likely to change with change in the value of the underlying. And third point, the call options delta varies from 0 to 1, while put options delta varies from minus 1 to 0. I'm hoping that you now have a fair understanding of what delta is and how it changes for different strikes based on the type of option contract that we are looking at. So we are now ready to understand the concept of strike selection for buyers of options. This is the concept of delta acceleration. Okay, have you heard about hero or zero trades, where someone usually buys an out of the money or sometimes even a deep out of the money option, and the next day, based on where the market opens and moves, the trader stands to make a killing, generating mind-blowing returns, or on the opposite, he might lose all the premium he paid. Do you know why these people take these risky trades, and particularly why they select out of the money strikes? Now there can be different reasons. Number one, out of the money and deep out of the money options are much cheaper, so you only need to deploy lesser capital. Number two, since the premium paid is lower, the amount being risked is considerably lower, even though you stand to lose the entire premium amount. But the potential return that is available for the taking is limitless. But the most important reason, and maybe one of the reasons that most traders don't realize or maybe they don't care about, is due to delta acceleration. Let me explain this with the help of another graph. This right here is the delta acceleration graph, whose y-axis is the delta value from 0 to 1 for a call option, or maybe 0 to minus 1 for a put option. The x-axis represents moneyness of options for a change in spot price of the underlying. Now the concept is same for both types of option contracts, so we will discuss it based on call options. Now, there are 4 delta stages in the graph, from pre-development, takeoff, acceleration, and stabilization. Now, let us look into each one of them. Trust me, this is easier than you expect, so stay with me on this. Before we move ahead with the discussion, let me give you an example. Think of this curve as the different stages of a flight. Let me explain. At first, the airplane engine is turned on and it is on one side of the runway preparing for takeoff. But as of now, there is no visible movement. This is similar to the pre-development phase of Delta. Now, the plane starts to move, increasing its speed, or we can say the plane is gradually accelerating against a headwind. Now, this is similar to the second phase of the delta curve, where the delta tends to take off, or in simple terms, the delta values starts to accelerate gradually. Now the aircraft acceleration increases so much so that the headwind lifts the plane up, and this is where the aeroplane accelerates the most in order to counter the air resistance. This analogy can be used to represent the third stage of the curve, where the delta values accelerate the maximum and move so quickly. And finally, after reaching the desired height, the plane will stabilize and cruise at a particular speed. Analogous to this, the final stage of the delta acceleration curve is stabilization, where the delta gets capped at a high constant value, which is 1 for call options and -1 for put options. Now you can think of this the other way around also, which is analogous to when an airplane prepares to perform a landing. But in that case, instead of the flight accelerating, it is actually decelerating. So the delta in the opposite situation will also decelerate and gets capped down to a lower value, which is 0 for both call and put options. Now pardon me for this terrible physics lesson, but I hope you understand my point, right? Now let's look at the 4 stages once again and come to a conclusion as to which strikes are the best to buy if you are an option buyer. But as a side note, delta of an option changes with other factors other than the spot price itself. But for the sake of simplicity of calculations, we will consider that the delta of a particular strike remains the same even if the spot price changes. So the first stage is pre-development. Now, this is the stage when the option is out of the money or deep out of the money. So the delta value here is 0 or close to 0. Now the delta will remain close to 0 even when the option moves from deep out of the money to out of the money. For example, when the Nifty spot price is 18,000, then 18,500 call option is deep out of the money, which is likely to have a delta of anywhere near 0.05. Now, even if the spot price moves from 18,000 to, let us say, 18,100, the delta of 18,500 call option will not move much, as 18,500 call option is still an out of the money option. The delta will still be a small non-zero number like 0.09 or something. So if the premium for 18,500 call option when the spot value is at 18,000 is rupees 10, then when Nifty moves 100 points to 18,100, then the premium is likely to move by 100 multiplied by 0.05, which is equal to 5 points. Hence the new premium will just be rupees 15. Now this may look like a very small change on an absolute scale, but when you think of it in terms of percentages, then the option has increased 50%. So what is the conclusion that we derive from this observation? Even though deep out of the money options tend to have an impressive percentage returns, but for such a thing to happen, the spot price has to move by a large value. So as an options buyer, would you buy deep out of the money options? Personally, I would ask you to avoid buying deep out of the money options because first of all, the deltas are really small or the speed of the premium change is negligible. And secondly, the underlying has to move massively in order for the options to work in your favor. However, for the exact same reasons, selling deep out of the money options makes sense. Now, the second and third phases are takeoff and acceleration. This is where the maximum potential for making money lies and therefore greater the risk. Now, let me explain. Now, takeoff is a stage when an option transitions from out of the money to at the money. Consider that Nifty spot price is at 18,000 and the call option strike under consideration is 18,200 call option, which is a slight out of the money option whose delta is close to 0.25 and the premium is rupees 25. So when the spot price moves 100 points from 18,000 to 18,100, what do you think will happen to 18,200 call options premium? Since the delta is 0.25 and the change in underlying is 100 points, the change in the premium will be equal to 100 multiplied by 0.25, which is equal to 25 rupees, and therefore the new premium will turn out to be 25 plus 25, which equals to 50 rupees. And that, my friend, is a 100% return. Now, isn't it clear that for the same 100-point move of the underlying, the slightly OTM options behaves very differently from deep out of the money options? So what have you learned from these observations? The slightly out of the money option, which usually has delta values ranging between 0.2 or 0.3, is more sensitive to price changes in the underlying. Now, as we have seen, for 100 points change in the underlying, the percentage change in the slightly out of the money options is quite spectacular. Now, this is exactly how options traders double or triple their money by buying slightly out of the money options when they expect big price moves in the underlying. But does this mean that we have to stick with buying slight out of the money options as an option buyer? Well, we are not quite there yet to answer the question. Let us take this a step forward and see how an at the money option, that is 18,000 call option in this case, which has a delta of around 0.5, would react to the same 100-point move in the underlying price, which moves from 18,000 to 18,100. Let's say the premium of 18,000 call option is 70 rupees. Then for a 100 rupees change in the spot price of the underlying, the option premium is expected to move 100 multiplied by 0.5, which is equal to 50 rupees. So the new premium will become 70 plus 50, which is equal to 120 rupees, which is a decent return of 71.4%. Now, are we ready to make a conclusion? Not yet. We have one more stage to consider. And the final stage is stabilization. This is when an option transitions from at the money to ITM and deep ITMs, and the delta starts to cap and stabilize at the maximum value of 1 for call options and -1 for put options. It is evident from the graph that the delta of call options will start to flatten out when it reaches the maximum value of 1. This means the option can be in the money or deep in the money, but the delta gets fixed to 1 and the delta would not change any further. Now let us understand how this works. Consider Nifty spot price to be 18,000 and consider two call option strikes, namely 17,900 and 17,500. 17,900 is a slightly in the money option having a delta of 0.65 and a premium of 120 rupees, while 17,500 call option has a delta of 0.95 or assume it to be 1 and it has a premium of 340 rupees. Now if the underlying changes by 100 points, that is Nifty moves to 18,100, then how do you think the two options will behave? To figure that out, the change in premium for 17,900 call option will be equal to 100 multiplied by 0.65, which is equal to 65 rupees. So the new premium will be equal to rupees 120 plus 65, which is equal to 185, which is a 54.2% rise. While in case of 17,500 call option, the premium change will be equal to 100 multiplied by 0.95, which is equal to 95 rupees. So the new premium will be equal to 340 plus 95, which is equal to 435 rupees, which is just a 28% rise in premiums. Now, when we observe closely, we can infer that in terms of absolute change in the number of points, the deep ITM options wins over the slightly ITM option. However, when we consider it in terms of the percentage change, it is the other way around. Clearly, the slightly ITM options are more sensitive to changes in the underlying, but they are certainly expensive than ATM and slightly OTM options. Now, what are the conclusions from all these observations? So one of the key takeaways from this graph is that delta values are capped after a particular limit. This means that irrespective of how much the spot price falls, and even if the call option goes from out of the money to deep out of the money, the option's delta will cap and will remain at 0. Similarly, even when the delta moves beyond ITM to say deep ITM, the delta value does not change, or it stabilizes and stays at its maximum value of 1. You can notice similar characteristics for put options delta also. Therefore, as an option buyer, you should avoid trading on deep in the money and deep out of the money option. The reasons being, deep out of the money option is not sensitive enough to the underlying price moves, so the absolute premium change is negligible. Now, in terms of deep in the money options, it is certainly expensive and most of the time it is illiquid. But since it has a very high delta value, meaning that they are more sensitive to changes in the underlying, we could buy deep ITM options instead of futures contracts for the same underlying for a much lower price. For example, one lot of Nifty futures cost roughly around 1.5 lakhs, while one lot of deep in the money options cost anywhere just from 40,000 and above. So it's relatively cheap. But the downside is that options are a decaying instrument, unlike futures. And secondly, most of the time deep ITM options are illiquid, so there might be large slippages. The second point is when you expect big price moves in the underlying. Then I will recommend you to buy slightly OTM options because you can expect to win big, given the fact that the delta acceleration really come into action during the takeoff and acceleration phase. During big price moves in underlying, the slightly out of the money options tends to move quickly between the different stages of ATM to slightly ITM, giving eye-popping returns. Now, if you don't expect very big price moves or you just want to scalp the market, then at the money options are the best. It is more sensitive to changes in the spot value when compared to out of the money options, and it is much cheaper than slightly in the money options. And since at the money options delta is high, the underlying need not really move by a very large value. And even if the underlying moves by a very small value, the option premium will change. So in short, if I were buying options based on some momentum strategy, I will definitely choose a strike having a delta from anywhere between 0.35 and 0.55. That is, I will buy either a slight OTM or a slight ITM or an ATM option strike, depending on how strong my conviction is regarding the price movement in the underlying. Now, this is a very simple hack that you can use if you are an option buyer. And as a closing note, options behave differently when it comes to expiries. As you may know, that during expiry, all the out of the money options will go to zero, and so will their deltas. This is perfectly explained using this particular graph. The horizontal axis shows the days until expiration, and the vertical axis shows the delta values. So as you can see, both call and puts are approximately at plus or minus 0.25 delta with 21 days to expiration. As time erodes, there is less and less chance of both the OTMs and deep OTMs expiring in the money. So the corresponding delta for each option approaches zero as the expiration date closes in. So try to stay away from OTM strikes when you are very close to the expiry. I hope you guys now have a clarity and proper reasoning as to how to select a particular strike when buying options. Now, there are a lot of other factors playing in the market that affects premium, like implied volatility, time decay, etc. But this is a simple and less complicated method for strike selection.
You may probably be familiar with some of the popular chart types, be it line chart, bar chart, candlestick charts, etc. All these charts have uses of their own. There are advantages and drawbacks, there is simplicity and complexity. But there is another type of chart that you should know about that uses a totally different technique to display market price action. It is a simple chart without much complexity, but still manages to deliver a lot of information, which is really cool. It is none other than the Hikenashi chart. Before we talk about what Hikenashi is, we need the answer for why in the first place we need to learn about Hikenashi charts. The simple and straightforward answer to this question is associated with the details that we require as a trader. Let me explain. Sometimes when seeing a lot of details on a chart, it can lead to a more enhanced and refined interpretation of what is happening in the chart. But there are other times when seeing too much detail is equivalent to seeing nothing at all. Take a look at this chart. It is a line chart. It looks fairly easy to interpret as there are only two major movements taking place.
there is a sharp uptrend and a longer downtrend, we could say that there is very little information available, because line charts erase open, high and low points as it only considers the closing prices, and in addition to that, it erases any trading gaps that might have occurred. So this chart may be filtering out some crucial information that might be critical to a trader's decision-making process. Now, if you had to trade using this chart, it would be very difficult to get a deeper insight into the market sentiment, and it will be nearly impossible to set detailed entry or exit processes based on support, resistance, and retracements. Now let's pull up a traditional candlestick chart in order to see this price action in much greater detail. Now you can see the open, high, low, and close prices of each trading session. You can clearly see which days were bullish and which were bearish. You can even see the price gaps. From this point of view, it is also easy to see the general market trends. And if you are someone who simply follows the swing highs and swing lows, then it might be relatively easy to follow the trend. I even agree to the point that these traditional candlesticks are great at helping you find good entry points, since they display potential reversals using pin bar candles like hammers or shooting stars, or display breakouts using strong candles like a bullish or bearish Marubozu, which closes above a resistance level or below a support level respectively. But what about once you are in a trade? Imagine having to make trend-based decisions after each candle. When a bullish candle is followed by a bearish candle, which is followed by another indecision candle, there will be a lot of emotions in play. There will be highs and there will be lows, and it will be like riding a roller coaster. This is where applying the Hikenashi technique to a price chart can help you decide whether to stay in a trade or get out. It is as simple as that. Hikenashi charts make candlestick charts more readable for traders who want to know when to stay in a trade and ride a strong trend, and when to get out when the trend weakens. So basically, Hikenashi is a modified candlestick chart technique that rearranges how the price is displayed so that the trend traders can have a higher confidence level when deciding whether to remain in a trade or exit their positions. Now talking about details, it has a lot more detail than a line chart, though not as much detail as a candlestick chart. But in terms of trend analysis, it has a lot more clarity than traditional candlestick chart, though not as much clarity as a line chart. Now, having understood why we need to consider Hikenashi, we are ready to take a look at what Hikenashi is. Starting from the grassroots level, the Hikenashi trading technique was developed in 1700s by Munehisa Homa, a rice merchant from Sakata, Japan, who is considered to be the father of candlestick charts also. So in Japanese, Heiken means average and Ashi means pace. Clubbing together, Hikenashi represents the average pace of prices. So if you are new to the market, the Hikenashi chart will look similar to the traditional Japanese candlestick charts, but it's not the same. Each Hikenashi candlestick has a body and an upper or lower shadow or wick. But trust me, there is a big difference between the two types of candlestick charts. You can't just use Hikenashi candlesticks like normal candlesticks. Most bullish or bearish candlestick patterns that you find in normal candlesticks are sometimes not found in Hikenashi. We will discuss why this will happen in a short while. This Hikenashi charting technique is used to help filter market noise. In addition to that, these candlesticks can be used to identify trending periods in the market, identify potential reversal points, and it can even spot classic technical analysis chart patterns with much ease. Now you may have a question running in your mind. How is Hikenashi different from a typical candlestick? In order to understand this better, let's put up both these charts side by side. The chart on the left is traditional Japanese candlestick chart, and the chart on the right is Hikenashi chart. And as you can see from the chart on the right, the Hikenashi chart has smooth directional price moves with more successive bars of the same color, which gives a clearer picture of the price movements. But the traditional candlestick chart changes colors frequently, from green to red and vice versa, making it difficult for traders to interpret and identify trends. You'll notice that Hikenashi charts have a tendency for its candles to stay green during an uptrend and red during a downtrend. This is in contrast to the traditional candlesticks that alternate color even if the price is moving strongly in one direction. And also, you can clearly see that Hikenashi chart is much more smoother looking in terms of price action, as it reduces the noise on the chart and it displays consecutive colored candles, making it much easier to interpret and identify prior price movements and current trends. Now this is the reason why usually long-term traders use Hikenashi charts as an alternative to traditional Japanese candlestick charts, while other short-term and intraday traders use them in conjunction with traditional Japanese charts, switching back and forth between the two. Another factor that makes Hikenashi different from traditional Japanese chart is how the price is displayed in terms of open and the close. Now, if you look closely at the Hikenashi chart, you will notice that each of the Hikenashi candlestick starts from the middle of the candlestick before it, and not from the level where the previous candlestick has closed. Now, Hikenashi candles acts this way due to the way in which they are calculated. So, it is a no-brainer that we need to learn how to calculate Hikenashi candles in order to unveil a lot more of its secrets. With the traditional Japanese candlestick charts, each candle represents the open, high, low, and close that the price makes within the current time period. This time period can be 1 minute or 10 minutes or 1 hour or any of them. But that's not the case with Hikenashi candles. With Hikenashi candlestick charts, each candle doesn't just include the price movement within the current time period, it also includes the price information from the past. Now let's look at how this is done. Just like a regular candlestick, each Hikenashi candle has a open, close, high and low, except that the open and close are calculated differently. This means that there are 4 parts of the Hikenashi formula. The open of a Hikenashi candlestick equals to the midpoint of the previous candle, which means the Hikenashi open price is equal to the open of the previous bar plus close of the previous bar, the whole divided by 2. Now this answers our question, and this is the reason why you will notice that every new candlestick starts from the middle of the previous one. Now talking about the high price of a Hikenashi candlestick, it takes the actual high of the current period. This could be the highest shadow, the open or the close, whichever is the highest. Now the low price of the Hikenashi candlestick takes the actual low of the current period. So this could be the lowest shadow, the open or the close, whichever is the lowest. Finally, the close of each Hikenashi candlestick equals the average value between the 4 parameters, that is open, close, high and low for the current price bar. So Hikenashi close price is equal to open plus high plus low plus close, the whole divided by 4. These calculations are really simple. But here we have a chicken and egg dilemma. Which came first, the chicken or the egg? Remember the fact that we need the previous candle for current candle calculation. So we need our first Hikenashi candlestick before we can calculate the future Hikenashi candlesticks. It has to start somewhere, right? Therefore, the first calculation simply uses the data from the current open, high, low and close. So the first Hikenashi close equals the average of the open, high, low and close, and the first Hikenashi open price equals to the average of the open and close price. The high and low prices of the Hikenashi candle is the high and low of the current candle itself. Now, even though this first Hikenashi candle is somewhat artificial, the effects will dissipate over time, usually within 7 to 10 periods. Now, the general idea behind Hikenashi candlestick is that they smooth price action. Much of the market noise as displayed by the traditional Japanese candlestick charts are minimized with the help of Hikenashi candlestick chart. But we have to note that this smoothing operation is due to the averaging out of various price levels. This means that the actual price movements will occur around the represented price. So it is similar to how a moving average functions. But the smoothing effect of a moving average depends on its look-back period. For example, a 20 moving average takes into account the data of 20 previous candles. But the Hikenashi chart does not require a look-back period. So in that sense, it is much simpler to use and offers more consistent results. But there's a catch. For swing traders and positional traders who trade based on end-of-the-day data, this will not pose a problem. But for day traders who trade in response to the immediate price movements, this might be problematic, as a day trader would have to wait until a candle has been completed. This delay might compromise a day trader's ability to be responsive to the markets. So if you are a day trader, it is better if you use a combination of these charts for analyzing the market. Now let us learn how to interpret Hikenashi candlestick charts. On normal candlestick charts, we observe the candle body and shadows to find the candlestick patterns. This process involves looking out for various possible patterns on the chart. It could be engulfing patterns, bullish and bearish Mariposus, morning and evening stars, bullish and bearish pin bars, etc. So it can feel overwhelming at times.
But when it comes to Hikenashi candlesticks, we can stick to a much simplified analytical process. And trust me, it is very easy to learn. So make sure you learn this properly before proceeding. Due to the reason that Hikenashi candlesticks are calculated based on averages, these candlesticks will have much smaller shadows or wicks than a regular Japanese candlestick. Just like with regular Japanese candlesticks, with a Hikenashi candlestick, the smaller the shadow or wick, the stronger the trend. So the logic remains the same there. Now, green candlesticks in general represent bullish sentiment or a bullish candle. But green candlesticks without a lower shadow shows strong bullish sentiment. This candle is also known as a bullish shaped bottom because the candle actually lacks a lower wick. Similarly, red colored candlesticks in general represent a bearish sentiment or a bearish candle, but red candlesticks without an upper shadow show strongly bearish sentiment. This candle is also known as a bearish shaved head because the candle lacks an upper wick. Now, these shaved Hikenashi candlesticks represent increased price momentum. Now, coming to the last type of candles, these are dojis or spinning tops with substantial upper and lower shadows, which indicates a neutral bias. It may either represent a possible price congestion or a reversal. Now, except for dojis or spinning tops, all the other Hikenashi candles have a very straightforward interpretation. This takes an enormous burden of a trader as you don't have to by heart a lot of candlestick patterns. So with this information of Hikenashi candles, we can figure out two things: the trend direction and the trend strength. Now, using Hikenashi to identify trend direction is quite easy. As mentioned earlier, the Hikenashi chart shows you the direction of a trend through its color-coded candles. So a green candle is telling you that the trend is up and a red candle is telling you that the trend is down. Now, in order to identify the strength of a trend using Hikenashi candles, you need to observe the shadows or wicks of the candles. So if you notice that for many green candles, there is no lower wick or shadow, and for many red candles, there are no upper wick or shadows. What this implies is that these candlesticks do not show a shadow in the opposite direction of the trend. So if it is an uptrend, there is no downside shadow, and vice versa for a downtrend, there is no upside shadow or wick. So when there is no shadow or wick in the opposite direction of trend, this means you are in a strong trend. So the main thing that you need to look out for on Hikenashi chart to determine the trend strength is shadowless or wickless candles on one end, which is opposite to the trend direction. Now, as mentioned earlier, these candlesticks that have no shadow or wick on one end are also called as shaved candles. That is, if there is no lower shadow or wick, the candle is called as a shaved bottom, and if there is no upper shadow or wick, the candle is called as a shaved head. Now let's take some example to understand these thumb rules as to how to use these candles to our benefit while trading. We have already talked about this in the previous section, but this revision will help you forge the rules in your mind. So rule number 1 is that green candlesticks signal an uptrend. So when Hikenashi candles changes from red to green, it is a sign that the price might be about to head higher. And if you are currently in a short position, you may want to exit. And if you're currently in a long position, you may want to add more to your positions depending on your risk appetite. Second rule is that green candlesticks with no lower shadow or wick indicate a strong uptrend. So when prices are trending up and you find consecutive bullish Hikenashi candlesticks with no lower shadows, then you are possibly witnessing a strong uptrend. You have to stay in the long position until the Hikenashi candlestick changes color from green to red, and ride the uptrend as long as no lower shadows appear and let your profits accumulate. Now, rule number 3 is that red candlesticks signal a downtrend. So when Hikenashi candle changes from green to red, it is a sign that price might be about to turn lower. So if you are currently in a long position, you may want to exit that position. And if you are currently in a short position, you may want to consider adding more to your position with respect to your risk appetite. Rule 4 is that red candlesticks with no upper shadow or wick indicate a strong downtrend. So when prices are trending down, and if you see consecutive bearish Hikenashi candlesticks with no upper shadows, then you are possibly witnessing a strong downtrend. You have to stay in the short position until the Hikenashi candlestick changes color from red to green, or you can just stay short and ride the downtrend as long as no upper shadows appear and let your profits accumulate. Now the final rule, or rule number 5, is that candlesticks with small bodies showing upper and lower shadows indicates a possible trend reversal or a trend pause. These are indecision candlesticks. Doji-like candles with both upper and lower shadows are possible turning points or reversal points, or the dojis or spinning tops could even appear during a price congestion or trend pullback areas where the price momentum is weak, and further the price might continue in the previous trend direction. So either way, confirmations are required before considering a trend reversal signal. So with that, we have covered all the basic stuff related to Hikenashi in this first part, and I think you now have a fair understanding on how to read Hikenashi charts. When discussing the application side of Hikenashi charts, there are 4 main ways or strategies in which I personally like to use Hikenashi indicator for trading. The first method involves using Hikenashi charts to find market turning points or reversal points and then take reversal trades from there. Now the second method is to ride the market trend using Hikenashi candles and letting my profits accumulate over time. And the third way is all about timing the market for my long-term investments or positional trades. And the final method is to find and trade chart patterns like triangles, wedges, etc. using Hikenashi charts. Now let's take a look at each of these strategies in greater detail. We will begin by finding market turning points using Hikenashi charts. So identifying market turning points or reversals with Hikenashi charts involves 2 steps. The main idea is to find shifts in the market sentiment. Now, how will you find such a shift in the market sentiment? So if you have watched the first video part, then you might have already guessed that we need to first find dojis or spinning tops with long upper and lower wicks on a Hikenashi chart. This step helps us to locate an area or zone for us to focus on. But it is important to note that dojis and spinning tops can highlight zones of either possible reversal or continuation where we can look for potential trading opportunities. In this particular strategy, we are only interested in reversal setups, or in other words, we are not looking for a trend pause and continuation. So once we have identified a suitable zone, in the next step, we switch back to the standard candlestick chart and look for reversal candlestick patterns. So these could be pin bars, morning or evening stars, abandoned baby patterns, etc. depending on the direction of trade that you are looking for. So take a look at this chart. I have circled all the candlestick patterns in the Hikenashi doji zones, which are in turn represented by rectangles. And as you can see, there was an evening star pattern at first, which is a 3 candlestick bearish reversal pattern. You can also observe a morning star candlestick pattern here, which is numbered 2. Now it is a bullish 3 candlestick reversal pattern. Now after the bullish swing that filled the earlier price gap and taking resistance from that level, the Hikenashi doji zone coincides with a 3 black rose pattern. This bearish candlestick pattern led to another downswing, which ended with a not so perfect double bottom pattern structure. In the next 2 trading zones, we can find 2 Morningstar patterns, but this time it has helped to push the bullish trend even further. Now this might look very cool and easy, but this trading approach is not perfect. Just take a look at the Morningstar candlestick pattern at the chart's bottom. The 2 bars before it formed a dark cloud cover pattern, which is a bearish reversal pattern. So if you would have taken that signal and gone short, it would have definitely resulted in a losing trade. But the general idea is to quickly identify areas of interest for further candlestick analysis. Now you can always make use of price action levels like support resistances, supply and demand zones, pivot levels, or even dynamic levels like trend lines or indicators like moving averages from which adequate buying or selling pressure could come in, thereby improving the probability of a winning trade. For example, a Morningstar pattern from a previous support level could result in a good long trade, and similarly, a shooting star pattern rejection from a previous resistance level can be a great signal for taking up a short reversal position. Now you can even use moving averages or a combination of 2 or more moving averages in association with Hikenashi charts. So it could just be a 20 moving average or maybe even 10, 20 and 50 moving averages. But the logic of the strategy will remain the same. You just have to find dojis or spinning tops in Hikenashi charts, then go back to the candlestick charts to find any reversal patterns. But in addition to that, we need to observe if the price takes a support at the 20 moving average level if you are looking for a long trade, or if the moving average acts as a resistance if you are searching for short trading setups. Then you could simply ride the price move by switching back to the Hikenashi chart and exit either when the Hikenashi chart forms a doji or a spinning top, or you can even consider exiting your position if the price breaks beyond the moving average level. And if you are planning to use two moving averages like 10 or 20 moving average, then in addition to all these factors, we will also check for a crossover between the two moving averages. So these are some of the basic setups that you can think of. But if you ask me personally, I like to make use of support and resistance levels along with rejection pin bar candles in traditional candlestick charts in association with Hikenashi charts for a higher probability trade setup. I even make use of CPR and pivot levels along with rejection pin bars for my reversal trades. Now let's discuss on how to ride the market trend, thereby letting your profits accumulate with the help of Hikenashi analysis. So here's a question for self-analysis. Are you one of those traders who have problem with looking at your charts for so long, or are you someone who cuts your positions prematurely, thereby not letting your profits accumulate, but regret losing the big price move that you could have captured if you have not exited too early? Now, these are some of the biggest issues that most traders face. But what if I tell you that by using Hikenashi charts, you could solve these problems to some extent? Now let's take a look at a very simple method of taking profits with Hikenashi charts. This idea is very basic and easy to implement. So the idea is that whenever a Hikenashi candlestick goes against our trade, we will exit our position. So if you are in a long trade, exit when you see a bearish Hikenashi candlestick if you are very conservative. This could even be a bearish small bodied candle. But if you want to remain in the trade for longer, or you are willing to take a tad bit of risk in the hope that the price will continue to trend, then consider exiting only when a strong bearish candle appears. But it is better to be cautious when an indecision candle or a bearish candle first appears, so that you can get ready with your exit order and can act fast in case of any opposite scenario. On the contrary, if you are in a short trade and if you are very conservative or risk intolerant, then exit when a bullish Hikenashi candlestick forms. But if you have more risk appetite, then be cautious if a candle formed is an indecision candle or a weak bullish candle, because there is still a chance for the current trend to resume. You will only exit when a strong bullish candle appears. Obviously, this waiting could reduce your profit at times, but the scope of riding a big trend once in a while can compensate for all these small losses. But as I have mentioned, it is up to you to decide based on what your risk appetite is. So if you are a beginner, I will ask you to stick with the first basic method of exiting at the first sign of a position rather than waiting for a continuation. You can stick with this simple method as long as you gain confidence, and once you learn to identify the underlying price action, you can wait out on few occasions where the trend can really play out, providing with enormous returns. And also keep in mind that most of these Hikenashi strategies work well in longer time frames. So if you are a swing or positional trader or even an intraday trader who trades on higher time frames, that is anything above 15 minutes, then these methods can work very nicely for you. But if you are a scalper or a very short-term trader, then it is better you exercise caution or maybe avoid Hikenashi altogether, because the averaging out or smoothing effect can badly affect your responsiveness in the market, meaning that you can struggle with fast entries and exits. Now in this chart, I have marked the exit points for both long and short trades using a straightforward tactic. Even though these exit points are not perfect, they are more than enough for a beginner trader to make some profits when coupled with a reasonable stop loss and a good reward to risk ratio. Another way to improve your odds is to make use of areas of values like supports and resistances to take entries. That is, you will take a short entry only from a resistance level and you will enter long trades only from support levels. This will help you to filter out some of the bad trades, leaving you with some good setups to trade on, and also help you to set a proper stop loss with respect to the area of value under consideration. But what's more interesting is that if you had applied the same exit method using a standard candlestick chart, you would have exited with much smaller profits. So with traditional candlesticks, it is very common to feel anxious watching the market move against you. This anxiety or fear might push you to exit earlier than you should. So by simply switching to a Hikenashi chart to monitor your trade, you will be able to remain in the trade longer and ride potential trends and accumulate larger profits. Now another point to note is to keep a trailing stop loss. which could be a chandelier stop or just a simple moving average, depending on your trading time frame. So that you can ride the trend as long as it lasts without prematurely cutting your positions during a minor pullback. This is a more advanced technique and requires more control over your emotions and a good understanding about the real-time price action in play. So if you are a beginner, then stick with the basic rule. Now let's talk about the third method, which is timing our long-term investments using Hikenashi charts. Now you might be really confused because generally for long-term investments, exact timing is not critical when comparing to intraday or even swing trades. This is because for long-term investments, you are more likely to have a bias towards fundamental analysis, and it is one of the main reasons why many of you don't even invest. And even if you invest, you will not even use a strict technical stop loss to protect your capital if things go haywire. But the Hikenashi charts can help you with your investments as it highlights the trend changes, which can be used for timing your long-term positions. It saves you time and effort from overanalyzing the technicals and crunching over the fundamental data. So before we get to the idea, let's look at a scenario. This chart shows the market sell-off in March 2020, triggered by the coronavirus pandemic and other global concerns. Now this is a weekly chart of Nifty. You could take any other major stock during the crash and most of them would have reacted similarly. Now almost all stocks were available for purchase at a discount. Let's say you think that the market has overreacted and you are still bullish about the future. You would like to take this golden opportunity to accumulate a long-term position in Nifty or in any other stock. But then you have to remember one of the golden rules in the market. It is never to catch a falling knife. You should hope for at least some bullishness before you enter the market. Now what should we do? Now you could just take a look at the Hikenashi version of the same Nifty chart and you will clearly see a shift in the market sentiment as represented by a doji candle which is followed by a bullish candle. Now you can consider accumulating your positions from this point onwards. Further, at each point when the Hikenashi candlestick turns green after a short pullback, you could increase your market positions. This gives you a system to increase your investment position each time you detect bullishness in the market. Now this is one example. The system is so simple that you don't really need to do extensive fundamental research. But that simplicity could sometimes be a problem too. Because doji and spinning top candles may not always indicate a reversal. It could just be a consolidation. So the reversal might not happen always and you could end up with a negative portfolio. But you can always improve your odds if you bring in additional confirmations. It could be price action, 52-week data, technical analysis, or even fundamental analysis on the stock could yield much better outcomes. So keep in mind that the general idea is to invest on pullbacks if you are aiming for very long-term investments or positional trades. This will also help to average out your positions. And you could also make use of indicators like 200 period moving averages to analyze the overall market sentiment before making allocations also. Now the last method is to trade chart patterns using Hikenashi charts or candles. You could easily find a lot of chart patterns ranging from double tops and double bottoms to triangles to wedges, channels, etc. But I like to use Hikenashi charts to trade triangles and wedges and sometimes even price channels. So if you want to learn more about chart patterns, I have already made a 3-hour long video on this topic. You can refer to that video to know more. Now let's talk about triangles first. Now there are 3 types of Hikenashi triangles: ascending, descending and symmetrical triangles. So if the price breaks above the upper boundary of a symmetrical triangle or an ascending triangle, then it is very likely that the uptrend will persist. You could look for long trades. Entries, stop loss and targets can be learned from the chart patterns video. Now I would recommend you switch back to the traditional candlestick chart to take the trade entry, because you will have more flexibility in deciding whether you want to enter during the breakout or do you want to hold on a bit and wait for a pullback or retest to happen so as to get a much better entry price. On the contrary, if the candle drop below or break below the bottom trend line on the descending triangle or a symmetrical triangle, then most likely the bearish trend will continue and you could look for short trades and keep appropriate entries, stop loss and targets. Now also keep in mind that breakouts usually require additional confirmations so that you don't get trapped in a fake out. So make sure to check for higher than average volume indication and check momentum indicators like RSI or Stochastic to ensure a real breakout before taking a trade entry. Now, another point worth noting is that in order to trade the trend with this Hikenashi technique, it is advisable to use a trailing stop loss like a moving average or Chandler stop so that you could stay in the trend to profit from it if the trend is very strong. Now let's talk about wedges. And as you may know, there are two types of wedges, rising wedges and falling wedges. Wedges are also a little more like triangles. So a rising wedge requires a trader to wait until a candlestick breaks below the pattern's bottom support line. And once that break happens, you could take a short trade because rising wedge is considered as a bearish breakout pattern. You could set your stop loss and targets appropriately. On the contrary, if you have a falling wedge, then you should wait for the price to break out above the upper trendline resistance, and there are high chances that the downtrend will reverse. So you could consider taking a long trade entry and set your stop loss and targets accordingly. Also make sure to trail your stop loss if you want to make most out of the trade in case a strong trending price action is in play. Now you can even trade channel patterns with Hikenashi. Channels are considered to be neutral or bilateral patterns, meaning that the price can either break out of the resistance trend line or break down below the support trend line. So whenever you are trading breakouts, you need confirmations. And these confirmations can come in form of a higher than average volume, which could in turn signal an increased amount of market participation, or breakout can also be confirmed using momentum indicators like RSI or stochastics. Sometimes using volume data and indicators in tandem can yield a much stronger signal. So in this case also, we should try to ride the price move using trailing stop losses, thereby maximizing our profits. Now at the end, let's discuss a few benefits and limitations of Hikenashi technique. So let's start with the benefits first. The most important point is accessibility. So Hikenashi is one of the most accessible indicators that do not require any installation, and it can be found on any trading platform, and it's free of cost. Second advantage is high chart readability. Hikenashi charts are very easy to interpret. The Hikenashi candlesticks can be easily analyzed than traditional candlestick charts, so it is easier to identify market trends and price movements. Also, you don't need to study all the traditional candlestick patterns by heart. Third and most important point is reliability. Hikenashi is a very reliable indicator, providing much accurate results. It uses historical data, which is quite dependable. Now, the fourth prime advantage is its ability to filter market noise. So it filters out market noise and reduces all those small corrections, making the signals more transparent. So this smoothing effect makes it easier for trend identification. So by filtering out noise, the Hikenashi charts can help traders to plan their entries and exit points more effectively. Now, another benefit is the ability to combine with other indicators. So just like candlestick charts, the Hikenashi charts can be combined with other technical indicators to give even stronger signals on the market movement. And the final advantage that I have noticed is time frame tolerance. So Hikenashi can be used on any time frame, from hourly, daily, monthly, etc. So market participants with any trading style can adopt this technique. However, the bigger the time frame, the more reliable the signal is generated. Now let's talk about the limitations or drawbacks of Hikenashi technique. The first point is time gap or delay in signals. Since Hikenashi indicator uses historical data, it provides a delayed signal, or it is a lagging indicator. Even then, this delay cannot be an absolute weakness because it significantly reduces the number of false signals and can prevent false entries. Now, the second downside is the lack of price gaps. Now, most traders use price gaps to analyze price momentum, trigger their entries, or place their stop loss orders. Price gaps even function as supply and demand zones. Although Hikenashi lacks price gaps, you can counter such a limitation during trading session by switching between traditional candlesticks and Hikenashi. Another drawback is the unavailability of the complete price information. So Hikenashi data, as you may know, is averaged, hence it does not show the actual open and close prices. So this may not work very well for very short-term traders or scalpers. So I would generally recommend using Hikenashi charts for swing trading, positional trading, and long-term trading. This is because the larger the time frame you use, the more valid the market momentum detected. And if you use a time frame that is too small, then detecting momentum in the market will be much more difficult. Therefore, this chart is not very suitable, especially for traders using scalping techniques. Now, to wind things up, if we depend solely on Hikenashi chart, we might miss key price features like price gaps and candlestick patterns. This is why I recommend using Hikenashi chart to identify noteworthy price action before switching to standard candlestick chart for further analysis. For instance, when the market is in a clear trend, there is no need to overanalyze. But when the market starts to stall or consolidate, then it is time to assess if the market is merely taking a break or preparing for a reversal. So in a nutshell, the Hikenashi candlestick chart is a simple yet powerful tool that, if used in the right manner, can yield tremendous results in your trading.
I'm about to give clarity on a question that is flooding the comment section of most of my videos, be it on YouTube or on Instagram. The questions are none other than, what is the best time frame to trade the market, or what is the best time frame to use this strategy or trade that pattern, so on and so forth. So I totally understand that the traders who ask these sort of questions are especially those who are new to the market. And how am I so sure about that? The simple reason is that they are unaware of their own trading style. Now let me break this down to you. Newbie traders often wonder if there is a perfect time frame that is better to trade than others. But the truth is, there is no single magical time frame to view the charts and make a profitable trade each time. So fundamentally, choosing the best time frame to trade will depend greatly on a trader's preferred trading style and the strategies used. So in this video, I will help you discover a time frame, or rather time frames, that you can make use for your analysis and for trading. So in that context, I will be discussing the following topics. We will start by determining the relevant time frames based on different trading styles. Then we will discuss the multiple time frame analysis by identifying the trend and trigger signals that you can make use of. And we will wrap everything up by learning how to use the multiple time frames to do general market analysis, to spot trigger signals and enter our trades. As you may already know, there are different types of traders and equally different trading styles with respect to the expectations, risk tolerance and time frames they trade. They may be classified into short-term, medium-term and long-term trading styles. The short-term traders includes the intraday traders and the scalpers. The medium-term traders are the swing traders. And finally, the long-term traders includes the positional traders. Now let us take a look at each one of them in detail to understand what their mindset is all about. So let us start with positional traders first. Positional trading is for long-term trades or expectations. So if you buy and hold stocks for several months to years, it is called as positional trading. Here the distinction between a positional trader and a long-term investor gets a little blurry. So most positional traders follow a combination of both technical as well as fundamental analysis before taking up a position. For positional trades, they usually look at the daily, weekly, and sometimes even the monthly charts. So in short, your objective is to capitalize on the long-term potential of a particular stock or a security. And if you do find a favorable setup using technical analysis or price action, then you will have to go deeper into the analysis of the business potential and the fundamentals of the company. Some of the positional trades can stretch anywhere between a few months to several years. Therefore, without understanding the business properly, it is difficult to get the conviction to give a large percentage of allocation for a particular stock in the portfolio. So once you understand the business, you will gain the confidence to invest more and hold it for a long period of time. And this is one of the reasons why many new traders tend to avoid this approach, and also because it takes a long period of time before the trades are realized. But from what I have understood, the shorter the time frame and the expectation, the more noise and confusion arises in your trading. Now coming to swing trades. Swing trades are more relaxed in nature compared to short-term trading. They do not carry the pressure of finding new trades every day, and therefore the decision making is slower. So if you do not like watching the charts throughout the day, or if you don't have the time to do so, and also if you don't want to wait a long period of time to realize your gains, then swing trading is your best course of action. The most commonly used time frames for swing trading are the hourly and daily charts. So in short, if there is an opportunity for a swing trade, I usually end up analyzing both the hourly as well as the daily charts to understand the direction of the trend along with the important support and resistance levels. My advice is that if you are a beginner to the stock market and you wish to make trading your profession in the future, it's always better to start as a swing trader and gain experience. The reason why I say this is that you can significantly improve your risk management because you can have a higher margin for error and more time to make your decisions. But try to avoid small caps and mid caps for the first few months. Just stick to the Nifty 50 stocks and try to trade in small amounts. This way you can boost your experience and understanding of yourselves. So understanding your own nature is the most important thing if you want to become a successful trader. And this is one of the benefits of swing trading, that the traders can get the advantage of both the styles, that is a long-term and a short-term perspective, without necessarily taking on the downsides that come with these approaches. Now coming to day trading, intraday trading can be one of the most difficult strategies to master. Newbie traders implementing a day trading strategy are exposing themselves to more frequent trading decisions that may not last very long. So this combination of inexperience along with the frequency opens the door for increased losses. And as I have already mentioned, this can be prevented if the trader opts for a slightly longer approach like swing trading. Now, intraday traders can use time frames between 5 minutes and 60 minutes. The most commonly used are the 15-minute and the 5-minute time frames on the chart. In India, as you may all know, the market is open between 9:15 am and 3:30 pm. And the goal of an intraday trader is to find a favorable setup, take the trade, and exit on the very same day. These trades are usually held for a period of few minutes to few hours. So in intraday trading, you are faced with multiple decisions in a short period of time, and this can in turn lead to confusions, FOMO, and mistakes that can prove very costly. But the benefit that I see with day trading is that day traders enter and exit their positions on the same day, unlike the swing and positional traders, thereby removing the risk of any large overnight moves. So at the end of the day, they close their position with either a profit or loss. Now the last trading style that we will discuss is the scalping, which is the shortest form of trading. Scalp traders only hold positions open for seconds or minutes at the most. These short-lived trades targets the small intraday price movements. The most commonly used time frame for scalp trading is between 1 and 5 minutes. So it's up to you to use the 1 minute time frame on the chart or 3 minutes or 5 minutes. Now some scalpers also use a 15-minute time frame, but very few go beyond that. Now the purpose of scalping is to make a lot of quick trades with smaller profit gains, but the idea is to let the profits accumulate throughout the day due to the sheer number of trades being executed in each trading session. Now this is a fast-paced trading style, trying to grab onto as many points as many times as possible throughout the trading day. So it can be stressful for many traders and is hugely time consuming, given the fact that you need to focus on the charts for several hours at a time. On top of that, the scalper or the day trader is in a position where they need the price to move quickly in the direction of their trade, or they want the price momentum to be in their favor most of the time in order to make some profit. So therefore, day traders and scalpers become tied to the charts. Now, obsessing over the charts for a longer period of time can lead to fatigue. Along with that, the shorter term approach comes with a small margin of error, as these stop losses are placed on the shorter time frame, which leads to a lot of noise or price swings. So I don't recommend any new traders use this style because it can take a heavy toll on your psychology. It is always better to start with a relaxed phase of trading, and when enough experience and risk management are gained, you can eventually step down your time frames, test other styles to see if they work. Now let's talk about the most important concept of this video, that is multiple time frame analysis. Now the multi-time frame analysis or the multiple time frame analysis is nothing but an analysis on multiple time frame charts of a single stock or an instrument. Now there are two major rules for multi-time frame analysis. Number one, the larger time frames establish and dominate the trend. What this means is that when a larger time frame trend is in play, you will see pullbacks in the smaller time frames. And these pullbacks in the lower time frames are nothing but noise against the flow of prices. Or in other words, in order to identify the trend, you will always have to look at the higher time frame charts.
The trend reversals begin in the smaller time frames first and then propagate upwards to the higher time frames. So this means that we will see a changing market structure showing up on a shorter time frame chart first before it is evident on a longer time frame chart. Now let us focus on what to look for when doing a multiple time frame analysis. Whenever you are planning to take a trade, you have to think about two important factors. Number one, the market trend or the general market sentiment. And number two is the trigger signal for the trade. Let me explain each of them. Identifying the general market trend can help you plan your trades in the direction of the prevailing market sentiment. This way, you can capitalize on the impulse moves and limit your losses by not trading against the flow of the market. Generally, for every trading style mentioned earlier, the overall market trend is given by the higher time frames. The reason for this is that a trend on a longer time frame takes more time to develop, which means that it will take a bigger market move for the price to change course. Also, the support and resistance levels are more significant in longer time frames. Now, some of the general methods used by traders to identify the general market trends includes identifying using the trend lines. So you may already know how to draw trend lines by connecting the swing lows and swing highs in the chart. I have already made a video on market trends, so if you want to learn more, please do check that out. Now the second method is by using the 200 simple moving average. Usually this method is used by traders over the daily time frame, so it can be effective for both swing as well as intraday trading styles. Another method involves the use of technical indicators like MACD, RSI, etc. to spot the long-term trend over a higher time frame that you are trading on. The second factor to consider is the trigger, which is none other than the signal that alerts you of a potential trading opportunity within the context of the overall market trend. The trigger signal can be anything from a breakout or a reversal from a support or resistance level. It can be a popular chart pattern breakout, or it can be based on candlestick analysis. The other popular methods includes the use of technical indicators like moving average crossovers or other indicators such as RSI, MACD, to name a very few. Now, the trigger signal is to be received in the lower time frame of your preferred trading style. It can be any setup of your liking. Now, most of the time, the trigger time frame can be the trade entry time frame as well. Now that we know what to look for in different time frames, let us dig a little deeper into how to do it by taking the multiple time frame analysis approach to a level further. Now, often there are traders who enter their trades on, let's say, 15-minute chart, but their higher time frame is on a monthly time frame, and it's silly. It is like looking for a ring on the ground with an astronomical telescope when you could have used a magnifying glass or simply your naked eyes to spot it. You get the idea, right? It doesn't make sense because both the time frames are too far away. You enter your trades on a 15-minute time frame and then you go to the monthly time frame for your higher time frame analysis. It is actually very irrelevant to you. Or how about this case where your entry time frame for your trades is the daily time frame, but you go down to the 5-minute time frame to time a sniper entry. Now once again, this does not make any sense either, because you are focusing too much on the minute details that are really unrelated to your goal. Anything you observe in a 5-minute time frame will appear to you as noise on a daily time frame. So if we know our trading style and the trigger time frame, how do we decide on a higher time frame? Or conversely, how do we decide on our lower entry time frame if we know our trading style and the market trend analysis time frame? So the method that I am going to discuss is what I have learned from Adam Grims and Dr. Alexander Elder. So the first point is that you have to set your trading style. So you have to decide if you want to be a swing trader or an intraday trader or a positional trader. Now once you know your trading style, you can use a factor of 3 to 6 to decide any time frame. Now let's see how it works. Let's say you are an intraday trader. As I have already mentioned earlier, the most common time frames for trade entry are the 5 minutes or 15 minutes. Let's say you are entering your trades in the 15-minute time frame. Now you can use a factor between 3 and 6. Now you'll take that factor and multiply it by your trading time frame. For example, in the 15-minute time frame, if you multiply it by 4, that's 60 minutes, which is equivalent to a 1-hour time frame. So the 1-hour time frame can be your higher time frame for the 15-minute time that you are entering your trade on. Or if you want to go with a factor of 6, that is also possible. The higher time frame in that case will be 90-minute time frame, which is a factor of 6 for the 15-minute time frame as your trade entry time frame. So anywhere between a factor of 3 to 6 is perfectly fine if you ask me. But what it requires is proper back testing, because a combination of higher and lower time frames that works for me may not necessarily work for you. So you have to find your own sweet spot. Likewise, let's say you are a swing trader and the daily time frame is your trading time frame, and maybe you want to better time your trade entry with precision on a lower time frame. And how do you define what's a suitable lower time frame for you? Well, once again, you can use a factor of 3 to 6. Now try to use the factor that gives you a time frame that is already available in the list of time frames in your trading chart. So in this case, 1 day time frame is approximately 7 hours, and if you use a factor of 6, our lower entry time frame will be 1 hour. So you can now use the 1 hour chart to time your entry better on the daily time frame you are trading on. I hope it makes sense. So bear in mind that when it comes to multiple time frame analysis, anywhere between a factor of 3 to 6 is a sweet spot. But I have specifically seen people use a factor of 5 more commonly, and that too for a reason. Let me also explain that. The logic remains the same. We use a factor of 5 to break up different time frames. So let's say in a month there are around 25 trading days. So if we divide 25 by a factor of 5, we will get 5 days, which is equivalent to 1 week, since the Indian markets are open for 5 days. Now a week has 5 trading days. So if we divide 5 by a factor of 5, we will get 1 day. So 1 day has around 6 hours and 45 minutes of active trading hours when noted from 9:15 am to 3:30 pm. So when we divide this by a factor of 5, you will get 81 minutes. Now even lower time frame becomes this 81 minutes divided by a factor of 5, which is approximately equal to 15 minutes. Let us match these time frames with the trading styles. So for a positional trader, the higher time frame can be 1 month followed by 1 week for the trigger signal, and an even lower time frame of 1 day to enter into positions. Now when it comes to swing traders, the higher time frame can be 1 day with a lower trigger time frame of 1 hour, and your entry time frame can be 15-minute time frame. And finally, in case of an intraday trader, the higher time frame can be the 1 hour time frame with a trigger time frame being 15 minutes and the entry time frame being as low as 5 minutes or 3 minutes. And if I were to mention about scalpers, the higher time frame can be as high as 15 minutes, the trigger time frame can be 5 minutes or 3 minutes, and the entry time frame can be 1 minute time frame. Now the trade exit time frame will not really depend on the time frames, but it will focus on your expectations or your risk to reward. But if you are carrying a very large position, you can always use the lowest entry time frame as your trade exit time frame. Now as I have mentioned earlier, you can always experiment with these time frames yourself, but always keep in mind the type of trader you are and the trading style you follow, and you will not be stranded. Now that you understand the whats and hows of the multiple time frame analysis, let's move a step forward and take an example each for an intraday and swing trading scenario. As we all know, day traders typically have the whole day to monitor charts and therefore can trade with really small time frames. So if you are a day trader, you can identify the market trend and the significant support and resistance levels that come into play during the day's trade on the 1 hour time frame. You can also make use of the 200 simple moving average. In this example, since the price trades predominantly above the 200 moving average and is moving upwards, the trading bias is naturally bullish. Now you can zoom into the 15-minute time frame to spot ideal trigger signals for trades, like a level breakout or a pattern breakout, reversal from levels, indicator signals, so on and so forth. The 15-minute chart allows the traders to get a closer look at how the prices are evolving on the lower time frame. In this example, the uptrend is also apparent in the 15-minute chart, which confirms a upward bias. So you can plan to take an entry when the price reverses from the higher swing low level, which is also a support level. And once the signal is confirmed, you can take a trade at the 15-minute time frame, or you can even move down to the 5-minute time frame or 3-minute time frame for an even better entry in terms of price, only if it matters. Now talking about a swing trading setup. Now swing traders generally tend to have significantly less time to spend monitoring the charts when compared to day traders, and their holding period may be over a day to a few weeks. So swing traders will look at the daily charts to identify the overall market trend and the support and resistance levels. Now along with that, they will also look for chart patterns to be formed on the higher time frame. Now taking this example, in a daily time frame, we can spot that the market is in a downtrend and that the prices are trading below the 200-day simple moving average. So naturally our bias is towards the sell side. Now zoom into your 1 hour chart to spot short selling trigger signals or trade opportunities. Now we can see that there is a bearish crossover as the 20 moving average crosses below the 50 moving average, which provides us with a trigger signal. Now you have the option to enter the trade at the trigger time frame of 1 hour, or you can choose an even lower time frame like 15 minutes to initiate your sell position. Now let me talk about some advantages of multi-time frame analysis. First of all, the multi-time frame analysis allows a trader to get a micro view of the larger time frames and then fine-tune an entry. An example would be having a pattern on a 1 hour chart, and you can then zoom into a 5-minute chart to confirm a trade entry. The second advantage is that risk can be managed more effectively by combining different time frames. It can help a trader to move the stops on smaller time frames for patterns that complete on larger time frames. And finally, using multiple time frames from higher to lower enables the trader to be aware of the contrary moves or the opposing patterns that form on the smaller time frames, which are against the longer time frame trend. In simple words, it helps you stop trading against the market trend. So to sum things up in order, to choose the best time frame, you have to consider what your trading style is and what trading strategy you wish to follow. These should be the factors which influence the appropriate time frame to be trading on. Thereafter, you can conduct the technical analysis on the appropriate time frames. But always ensure you implement sound risk management in all your trades. So keep learning, keep practicing, and that is it for this video. I hope you learned something new. If you did, please do like the video and subscribe to the channel, and do not forget to press the bell icon so that you won't miss out on any upcoming uploads. I will see you guys in the next video. Till then, see you.